Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. And in this video, we are gonna get started with a mega marathon for your CA Inter Paper 4 Cost and Management Accounting. Guys, this marathon is applicable for your May 26, September 26, as well as for your Jan 2027 exam onwards, right? So this is going to be a comprehensive marathon, and the total duration of this particular marathon, that is, we are going to split this marathon into two parts. Part 1 plus part 2 put together is going to be for a whopping 20 hours, right? And in this 20 hours, we will be covering 10 important chapters of our syllabus. In part 1, which is for approximately around 9 hours, we will be covering in detail marginal costing. This chapter alone is for about 4 hours, right? Because it has a lot of sub concepts inside it. Many students find this chapter a little difficult, hence every single concept, almost everything, I would have quickly recapitulated in this particular marathon. So marginal costing, standard costing, and budget, three big chapters. The last three chapters we're covering in the part 1, and in part 2 we are covering the balance 7 chapters for this particular marathon. Cost sheet, overheads, ABC, cost accounting systems, employee cost and direct expenses, material cost, and service costing. Right now overall this comes to about 20 hours put together. That is part 1 plus part 2. And guys, this marathon itself comes up with a coverage of roughly around 75 to 80 marks, roughly around 75 to 80 marks in your exam. This marathon itself gives you a coverage of so much. Now, I know many of you might have this question, sir, is it sufficient if I just watch this marathon? Guys, as the name goes, marathon is actually something that is meant for your revision. So please do not take this as a source of preparation. Now, once you have prepared, right, this will be a super helpful tool for you to revise the entire subject along with me to make sure that you score an exemption, right? So that's how I want you all to look at this particular marathon, right? So either if you have done a self study or if you have attended my classes, I request you to please have the library of adjustments with you and while watching this particular marathon, guys, because in this particular marathon I'm not just going to run you through the concepts. No, concept plus limited problem solving I'm going to do, right? Of course, we can't do all the problems in our regular batch as well as in our exam oriented batch. We solve roughly about 250 plus numerical problems, 250 to 300 numerical problems we actually solve in our regular and exam oriented batches. Of course, in the marathon, so representatively here and there, right, to cover certain concepts together, I take some numerical problems. So this marathon includes numerical problem solving, right? That is something I want to tell you all. And the most important thing I want to tell you all is regarding the books which have been used for this particular marathon, right? The first book is called as Concept Decoder. Guys, this particular book has all the concepts, right? Every chapter I would have segregated into concepts and core theory topics. Concepts are helpful. Look, all these things, the index is mentioned here. So concepts are helpful for solving your numerical problem, while your core theory topics are just meant for core theory. Look at this, for instance, cost sheet I've taken, right? Everything, what is a cost sheet, the format, everything in color, right? All these things have been mentioned. There is a reason for the color coding also. For instance, if you notice in cost sheet, there are 4 addition and 1 deletion, which institute came up maybe about recently. When I say recently, about 2018, when they revamped the syllabus, that's when they came up with it. Immediately I would have highlighted this in a different ink. The most important thing is a concept called doubt buster. What do you mean by a doubt buster? These are there are some common areas where students commit a mistake. So I have identified those areas, and under the respective concept itself, right, I have created the doubt and I would have guided you as to how to approach it. For example, cash discount is treated as a non-operating expense, should not be considered for any of your computations. This is just an example I just wanted to tell you, right? So this book itself gives you a complete control over all the concepts as well as the core theory topics. Of course, during the classroom I would have explained the the logic behind this and all of that, but this is a very effective tool to actually prepare as well as to revise the entire subject. So that's how it's been prepared. So that's the first book we're talking about, which is your concept decoder book. Then there is something called as a solved question bank, and this solved question bank, I have 2 volumes of solved question bank, right? If you notice here, so 1 second, I will tell you. Look, there are 2 volumes, volume 1 and this is volume 2, right? I'll just open and show it to you. This is the second volume, right? So now if you notice here, in volume 1 these chapters are there, in volume 2 the balance chapters are there, right? So depending on which chapter I'm covering in the marathon, right, you can take the respective volume 1 or volume 2. Is that clear, guys? Yes. And one more thing, sir, where can we find all these books? So of course the PDF of these books can be downloaded free of cost from my website costfin.in or from Shrestha website, right? In both the websites it is available under a tab called free resources. There you can download the PDF. If you want to purchase the hard copy, yes, so that also can be purchased separately, right? So the choice is yours, but yes, the PDFs are available free of cost, which can be downloaded. That's about it, guys, right? And most important thing, one more thing that I want to share with you all. Of course, as I told you earlier, this entire marathon, it gives you a weightage of roughly about 75 to 80 marks, right? Overall, with a 20-hour coverage, part 1 plus part 2. And guys, one more very important thing, we have uploaded something called a 3/4 strategy, right? Your exemption strategy, right? So give priority to those chapters as well. The most important thing is that based on the past attempts, we have been coming up with the past attempts, the tracker, generally about 90 to 95 mark in one attempt. Even 103 marks came from our 3/4 strategy plus the theory topic which I took the day before exam. Such is the importance of 3/4 strategy. I request you all to follow that as well, right? And guys, my humble request, you please follow this marathon in the same order, right? First watch part 1 and then go on to part 2, right? And one more thing I want to clarify. So these videos, these all these chapters, part 1 and part 2, were recently uploaded also. We are re-uploading these chapters because there is absolutely no change. The reason why we are re-uploading it is because maybe as we upload multiple other videos, right, this will go in the back. That's why we want to have a separate introduction for students who are appearing for May 26, September 26 and Jan 27. That's the reason we are actually re-uploading this video with a separate introduction, right? So on this note, let's get started with this marathon, and I'm sure you will find it super useful. So now let's get started with the revision of one of the most important chapters called marginal costing, right? So now before I get started with the revision of this particular chapter, there are a few things which I want to clearly mention before we start into this particular chapter. Number 1, now this is a common chapter, exactly the same chapter, marginal costing. The concepts are all exactly the same in your CA Inter Cost and Management Accounting paper number 4. And in your CMA Intermediate, there are 2 papers, paper 8 Cost Accounting and in paper 12 Management Accounting. Now this chapter, marginal costing, whatever we are going to learn in this chapter exactly is applicable in your CA Inter Costing and in CMA Intermediate paper 8 as well as in paper 12, whatever we are going to study. So this is a common marathon, right, or a revision video of this chapter, marginal costing, for both your CA as well as your CMA Intermediate courses. But let me tell you one very, very important thing. Now, when it comes to all the paid courses, be it your exam oriented batch or your regular batch, now I have done separate recordings for CA Intermediate, separate recordings for CMA Intermediate. Even there for paper 8 I have done it separately, paper 12 I have done it separately. I'm talking about the paid courses, be it exam oriented or your regular batch, right? So I have done separately, this entire chapter has been done separately 3 times, though the learning objectives, the concepts are all exactly the same. Now, this has been done strictly based on the respective institute study materials as well as the past exam questions and all of that. But when it comes to a marathon, for the purpose of marathon alone, I'm combining it so that the same marathon or a revision video will be useful across all the students. For all the students, they can use the same marathon purpose. So for marathon purpose alone, I am doing this particular chapter in a combined manner. Now guys, if you notice, I have listed out all the concepts which are applicable in this particular chapter: your income statement, profit volume ratio, break-even point, margin of safety, profit, cash break-even point, indifference point, volume analysis, sales mix, sensitivity analysis, limiting factor analysis, shutdown point, marginal costing versus absorption costing. These are all applicable for all the 3 subjects, that is one paper in your CA intermediate and both paper 8 and paper 12 in your CMA intermediate. This last concept, number 14, accept or reject of a special order. This alone is applicable for CMA intermediate paper 8 students alone. So I am pushing this to the end so that in case you are a CMA intermediate paper 8 student, you can watch this, else this part alone you can skip it, right? So clearly I have bifurcated in such a way that this is applicable for all the students. Exactly the same concepts are applicable for all the students, right guys? Fine. Now one more thing I want to clarify with respect to the books, right? We have a concept decoder book and a solved question bank, as you guys know. Now for CA intermediate costing, we have a separate concept decoder, solved question bank. For CMA intermediate paper 8, we have a separate concept decoder, solved question bank. And paper 12, we have a separate concept decoder, solved question bank. Every single thing is separate. Paid courses, your books, everything is separate. Marathon purpose alone, I'm combining for the benefit of all the students, so that because the concept is going to be the same, right? We will be covering, and in this marathon itself, I will be covering a few sums from your CA, few sums from your CMA. Now, do not think that, sir, then you are mixing the two, so CA students need not work out CMA questions, CMA students need not work out CA questions, nothing like that. These are all common questions. We are in a professional course, so if there is a particular concept, any which way they can frame the questions. So I am only doing things which are applicable everywhere. In case something is exclusive, I will clearly tell you it is exclusive. The last concept alone is exclusive for CMA intermediate paper 8 students. So this is also one thing which I want to clearly clarify before we get started into this particular chapter. Now on that note, let's get started with this revision of marginal costing. Now guys, the first thing we will do here is with respect to the basics of this chapter. Quickly we will revise. Now I will be starting from the scratch. Now marathon, so I will be in the marathon itself, I will be constructing the formulas and all these things. It will be a super reviser for you, so that you will be in a position to appreciate all the concepts, and a few sums also we are going to do in the marathon itself. Now let's get started. Now these first 5 concepts, I call it as the basic concepts. Now we will understand this basic concepts, revise this basic concepts with the help of a numerical example. Now let us say that the selling price is 10 rupees, the variable cost is 6 rupees, fixed cost is 10,000 rupees, the volume is 6,000 units. Now with this data, we need to prepare an income statement, marginal costing income statement, calculate the profit volume ratio, calculate the break-even point, calculate the margin of safety, and calculate the profit. Now quickly let's get started here. Now solution. Now guys, first the marginal costing income statement format looks as follows. Sales minus variable cost gives you contribution minus fixed cost gives you profit. Now in this case, what is going to be my sales? How many units am I selling? 6,000 units I am going to sell, and every unit is being sold at a selling price of how much? 10 rupees. So which means overall my sales value is going to be rupees 60,000. Now what's going to be my variable cost? 6,000 units each at the rate of rupees 6. It's going to be how much? Rupees 36,000. Right? Now, from your sales, if you subtract your variable cost, you get your contribution, or in other words, this contribution is nothing but your variable profit. Every time I sell a unit, I get a revenue of 10 rupees. I need to incur a variable cost. Means what? So only if I produce the next unit, I'll be incurring this cost, 6 rupees. Or in other words, every time you sell every unit, you get a variable profit of how much? 10 minus 6, which is going to be 4 rupees. So 60,000 minus 36,000, so gives you how much? It gives you rupees 24,000. Or I can also say this 24,000 is nothing but 6,000 units at the rate of rupees 4 each. Right? Now, this 24,000, is this your final profit? No. Why? Because fixed cost is there. We have not yet adjusted that. So now from this, subtract your fixed cost of 10,000 rupees, you will end up with a profit of how much? 14,000 rupees. Clear with this, guys? Now guys, basically, now every time I sell one unit, I will earn a revenue of 10 rupees. For me to earn this revenue of 10, I need to incur a variable cost of 6, which means the variable profit is going to be 4 rupees, popularly called as contribution per unit, is going to be 4 rupees per unit. We know that, right? Now, why do we use the word contribution, sir? Now, we can rather use the word variable profit. Simple. Now, what happens? Every time I sell one unit, I earn a variable profit of 4 rupees. Like that, I keep on selling multiple units. Overall, now I've sold how many units? 6,000 units into 4. I have built up a total variable profit of how much? 24,000 rupees. Is this 24,000 rupees my profit? No. Now, what do I do with this 24,000 rupees? First, it contributes towards recovery of fixed cost. With this 24,000, I try to recover my fixed cost of 10,000 rupees. After recovering the fixed cost of 10,000, whatever is left over is called as my profit. Or in other words, this variable profit goes on to contribute towards recovery of fixed cost and then towards building my profit. Since it contributes towards two things, recovery of fixed cost and building your profit, we call this as a contribution. Clear with this, guys? So in this case, 10 rupees is my selling price, 6 rupees is my variable cost per unit, and then I can say the contribution per unit, short form is CPU. So contribution per unit is going to be how much? 4 rupees. 10 minus 6, 4 rupees. Clear with this, guys? Right? Now, this is how your marginal costing income statement looks like. So this is your A, marginal costing income statement. That's about it. Fine, guys. Clear with this? Next one. Let's move on to part B of the question. Now, in this part B of the question, what have they asked? Calculate the PV ratio. Now, very simple. Very simple. Now, let us say on a per unit level. Now, what is the format of your marginal costing income statement? Basically, it's sales minus variable cost gives you contribution, right? From that, minus fixed cost gives you profit. We know that. Now, on a per unit level, how much is the sales? Basically, my selling price is 10 rupees. My variable cost is going to be how much? 6 rupees, which means my contribution is going to be how much? 4 rupees, right? Or if you want it in value, for 6,000 units, we know that if I'm going to sell 6,000 units, my total sales is going to be simple. 10 into 6,000, 60,000 rupees, right? And my variable cost is 6 into 6,000, it's going to be 36,000 rupees. And my contribution is going to be 4 into 6,000, that's going to be rupees 24,000. Right, guys? Fine. Now, if I want to express everything as a percentage of my sales, or in other words, if I keep my sales as the base, and if I say, right, keep your sales as a base, that is going to be 100%. Now, if I want to express my variable cost as a percentage of sale, Now, can I say when my sales is 10 rupees, my variable cost is 6 rupees, or in other words, the variable cost is generally 60% of my sales. Yes, so 6 divided by 10 into 100. So can I say this is nothing but 60% of sales? So variable cost, if expressed as a percentage, I can say that it is 60% of my sales. Clear with this, guys, right? So this is called as variable cost ratio. BC ratio. What do you mean by variable cost ratio? Variable cost divided by sales into 100. Variable cost expressed as a percentage of sales into 100. Next, now I can also express my contribution as a percentage of sales. That is, contribution 4 rupees divided by 10 into 100. I can clearly say, so contribution expressed as a percentage of sales is how much? 40%. Now I can call this as PV ratio. What do you mean by PV ratio? Profit volume ratio. Are you clear with this, guys? Sir, why is this called as profit volume ratio? Basically, your contribution is nothing but variable profit. So your variable profit expressed as a percentage of sales is called as PV ratio. Are you all able to understand this? Yes. Now, guys, now, always remember one thing. Your variable cost ratio plus your profit volume ratio will be equal to 100. Why? Obviously, your sales is made up of what? Your variable cost and contribution, right? If variable cost ratio is 60%, then obviously 100 minus 60, 40% will be my PV ratio. Now, this way you can easily approach any kind of question which has everything expressed as a percentage. Are you all able to understand? Or in other words, guys, profit volume ratio is nothing but contribution divided by sales into 100. Now, don't think this can be calculated only on a per unit level. Now, on a per unit level, it is 4 divided by 10 into 100. Suppose if you want to take at 6,000 units level, no problem. You can take 24,000 divided by 60,000 into 100. You calculate and see. So 24,000 divided by 60,000 into 100. Once again, you will get 40%. How, sir? Simple. Contribution 24,000. How did you get? Simple. It's going to be rupees 4 into 6,000 units, right? Divided by what is the sales? 60,000. How did you get? Rupees 10 into 6,000 units. Anyways, both the numerator and the denominator are multiplied with the same units. Effectively, you will get only contribution per unit divided by selling price per unit. Are you all able to understand? So the proportion will not change because both the numerator and the denominator are multiplied by the same number of units. Are you all able to understand? So literally you can say PV ratio is equal to contribution by sales into 100 at any given volume level, or a per unit level, or on a total level. Fine, guys. So this is your story about profit volume ratio. With this, we have also completed the second part of the question. Third part of the question, what is this? Calculate your break-even point. So point C is your break-even point. Now, by the way, guys, as I told you earlier, separately I have mentioned all these things in the concept decoder book of the respective subjects. So your CA intermediate costing, CMA intermediate paper 8, CMA intermediate paper 12. Everywhere, everything is mentioned separately. And in the question banks, all the questions with past examination, your study material questions, past exams, everything is covered here. Now, for instance, I will just open and show it to you. This is your CA intermediate, your paper 4. Cost and management accounting. Here everything has been neatly condensed and presented here, right? For marathon purpose, so I'm mentioning it in such a way that quickly you'll be able to recapitulate everything. Now similarly for paper 8, once again the separate chapter we have in a separate book, right? This is a separate book, in fact, exclusively for paper 8. And similarly for paper 12, if you see, so here paper 12 management accounting, once again it is chapter number 3. Separately I have mentioned everything. These are all different books. All these books you can download it from our website, right? So I've made it clearly applicable. I mean, I've bifurcated it separately in the respective books. Nothing to worry about that, right? Only for marathon purpose I'm merging it, just so that in a common recording every student will get a proper learning objective. Right, guys? So now let's move on to the next one, which is called as break-even point. Now what do you mean by a break-even point? It is that point of sale where you will be left with zero profit. That is, there is neither a profit nor a loss. The profit is not positive nor negative. It is exactly zero. Or in other words, how many units should I sell so that my profit is exactly equal to zero? Those number of units is called as break-even point. Now guys, how will you compute this break-even point? Simple. Now, if I want to earn exactly zero profit, can I say it will happen at a point when my contribution exactly recovers my fixed cost and I am left with zero profit, correct? So I should be left with zero profit. When will you be left with zero profit? Only when your contribution exactly recovers your fixed cost, correct? Yes. So now can I say this break-even point happens at a place when my contribution is equal to my fixed cost. So we need to calculate how many units should you sell so that your profit is exactly zero. So, or in other words, at that point, my contribution will be exactly recovering my fixed cost, right? It will not recover more. If it recovers, if my contribution is more, then over and above recovering the fixed cost, I will be left with profit. If my contribution is less, I will not be even able to, I will not even be able to recover my fixed cost. Hence, I'll be left with a loss. So, exactly it should be equal to your fixed cost. Only then you'll be left with a zero profit or loss, right? Now we need to calculate how many units should we sell. Now, can I say, let us keep the number of units to be sold as X. So now contribution is equal to nothing but the number of units to be sold. Let us keep it as X into every time I sell a unit, I know I will be earning a contribution of how much? 4 rupees. So can I say X into rupees 4 should be exactly recovering my fixed cost. How much is my fixed cost? In this question, they have clearly given the fixed cost is going to be 10,000 rupees. So exactly I should be recovering how much? 10,000 rupees. Or in other words, can I say X should be equal to rupees 10,000 divided by rupees 4. Or in other words, it's going to be how much? 10,000 by 4. We will say it is 2,500 units. So if you exactly sell 2,500 units, so 2,500 into 4, you will generate a contribution of 10,000 rupees. From that contribution, subtract fixed cost, which is 10,000. Exactly, you will be left with zero profit or zero loss. Or in other words, we can clearly say your break-even point is 2,500 units. How did we calculate? 10,000, which is nothing but fixed cost, divided by 4, which is nothing but contribution per unit. Or in other words, we can say the break-even point formula, if you want to compute that in units, is going to be fixed cost divided by contribution per unit. As simple as that. Clear for this, guys? So why do we need to mug it up? So simple and logical. Beyond this, there is nothing that you will need. Clear with this, guys? Yes. Now, suppose break-even point is nothing but point of sale. How many units? What is the volume I should sell so that my contribution exactly recovers my fixed cost? That's my break-even point. Now, this break-even point can also be expressed in values because it is sales. No, sales can be expressed in units or in values. Now, suppose if I want to find out the break-even point in value, how can I do that? Very simple. Similar thing. So break-even point is a point at which what? My contribution should be equal to my fixed cost. Correct? So it is a point where my contribution should be equal to my fixed cost. Now, how much is the fixed cost? 10,000 rupees. Now, can I say contribution is nothing but, one way of arriving at the contribution is number of units, X number of units into rupees 4, contribution per unit. Or can I say contribution is nothing but sales in value into PV ratio? For example, in this case, PV ratio was how much? 40% in this question. So this 24,000 was the contribution when my sales was how much? 60,000. Or in other words, can we say 60,000 into 40%? Can I say will be 60,000 into 40% will exactly be 24,000. So can I say another way of computing contribution is your sales in value multiplied by PV ratio. So now we can say here, we can keep this as sales in value, or in other words, I can say this is your required sales X in value. I'm putting a rupee symbol here into PV ratio should be equal to 10,000 rupees. Correct? Now, or in other words, X, that is sales, required sales in value into how much is my PV ratio in this question? 40% into 40% is equal to rupees 10,000. Or in other words, X in rupees or in value is going to be rupees 10,000 divided by 40 percentage, or this is nothing but how much is it? 10,000 divided by 0.4. You get how much? Rupees 25,000 is going to be my break-even point in value. Or in other words, guys, very simple. Now I can say if you want to calculate the break-even point in value, the formula is fixed cost divided by PV ratio. Are you all able to understand? Now, sir, logic for this. So one second, I will just put it here. Break-even point in value is going to be fixed cost divided by PV ratio. What is the meaning of this? If you generate sales worth 25,000, now what will happen? Sales is 25,000 in this case. So now what will be the contribution? 25,000 into 0.4. You will be exactly generating a contribution of how much? 10,000 rupees. Now from this 10,000 contribution, subtract your fixed cost 10,000, you will be left with zero profit or zero loss. Are you clear with this? Or in other words, another way of doing simple, sales minus variable cost gives you contribution minus fixed cost gives you profit. Now I want to calculate how much sales I should make, right, to exactly earn a zero profit or zero loss. So now your profit is zero. Now fixed cost is given. I need to recover 10,000 rupees, which means my required contribution is how much? 10,000 rupees. Correct? Reverse work. Right? Only if I exactly generate a contribution of 10,000, my fixed cost of 10,000 can be recovered and I'll be left with a zero profit. Right, guys? Fine. Now we know this PV ratio concept. Now if I generate sales of 100, my contribution is generally 40. That's the concept of PV ratio. We know that. Now simple, if 10,000 should be equal to 40, how much should be 100? It is nothing but simple formula you can use mathematically. 10,000 divided by 40 into 100, or in other words, this is nothing but 10,000 divided by 40%, or this is nothing but this formula, fixed cost by PV ratio. Are you clear with this, guys? Logically you can arrive anything and you will be able to clearly complete this chapter. Not even a single formula needs to be mugged up. That's the beauty of marginal costing. Right now, guys, mugging up in costing and in FM also, I'm telling you, not even a single formula in the entire subject should be mugged up. Right? Mugging up in our subjects is not even a sin, it's a crime. It's a crime. You should not mug up because everything is so logical here. Now look at this. This is about the formula. Simple, guys. Break even point, if you want it in units, fixed cost by contribution per unit. Suppose if you want the same in value, denominator instead of contribution per unit, you put it as PV ratio. Always remember this. If you want the answer in units, it is going to be contribution per unit. If you want the answer in value, put it as PV ratio. You will get it. Are you all able to understand? This is all about the logic, and all these things in detail I have just explained it in a neat manner in the concept decoder of the respective CA and CMA books. Separately they are all mentioned. Clear with this, guys? That's about this area. So basically, what do you mean by a break-even point? It is that point of sale where your contribution exactly recovers your fixed cost and you're left with a zero profit or zero loss. That is all about this area of break-even point. Formula, if you want the break-even point in units, the formula is fixed cost by contribution per unit. If you want the answer in value, it's going to be fixed cost by PV ratio. As simple as that. Now let's move on to the next one, D. Let's move on to the next one, D. Now what is D? They have asked for something called as margin of safety. Now, how do you compute this margin of safety? Now, guys, very simple. Now, in this question, you guys tell me, overall, how many units have been sold? The example that I gave you. They have sold a total of 6,000 units, correct? Right. So they have sold a total of 6,000 units. So I'm keeping it here. The total sales made was 6,000 units. Right, guys? Fine. And what was the break-even point? The break-even point we just now computed. Let's put it in units. 2,500 units. So the break-even point was 2,500 units. Right, guys? So this is nothing but your break-even point. This is nothing but your total sales. Perfect. Now, what do you mean by margin of safety? Very simple. You've totally made sales of how much? 6,000 units. Now, if you sell 2,500 units, you generate a contribution that exactly recovers what? Your fixed cost, and you're left with zero profit or zero loss, correct? Now, any sale that you make over and above your break-even point generates a contribution that goes on to contribute towards building your profit. Are you guys clear with this? So overall sales 6,000 units is broken up into two. First 2,500 units, it generates a contribution that is meant for recovering your fixed cost. Once entire fixed cost is recovered, whatever contribution you earn goes on towards building your profit. So the number of units sold over and above my break-even point is called as margin of safety. Now, in this particular scenario, how many units have we sold over and above the break-even point? So we have sold, literally, so 6,000 units minus 2,500 units. Literally, guys, in this case, we have sold 3,500 units over and above my break-even point. This is called as margin of safety. Clear with this, guys? Or in other words, total sales minus break-even point gives you margin of safety. Are you all able to understand this? Now, a very, very important thing that I'm going to tell you, I call this as marginal costing jodis. A very, very important understanding that you need to have. These are all basics of marginal costing. So once you strengthen this up, automatically the remaining part of the chapter will be easy for you to appreciate. Now, guys, first one. Now, let me just write on the format of this, marginal costing income statement. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? Now, in this particular example, what was the total sales we made, right? 6,000 units into 10 rupees. How much was that? Rupees 60,000, right? What was the variable cost? Now, 6,000 units into 6. It was how much? Rupees 36,000. If you subtract the two, now, or in other words, what is the contribution? 6,000 units, each unit generated 4 rupees of contribution. So it's going to be 24,000, right? From this, subtract your fixed cost, 10,000 rupees. Literally, you are left with what? A profit of how much? A profit of rupees 14,000, right? Now, remember this for a lifetime. It's a very, very important understanding. Now, guys, the total contribution generated out of the total sales, that is 6,000 units, generated a contribution of how much? 6,000 units into 4. So the contribution generated by 6,000 units is nothing but the total contribution, 24,000 rupees. Are you all clear with this? So can I say my total sales is linked to my contribution, right? Next. Now, the contribution generated by the break-even point units, first 2,500 units, what was the contribution it generated? 2,500 into 4, 10,000 rupees, right? Or in other words, that is nothing but equal to your fixed cost, right? So the contribution generated by break-even point is going to be equal to your fixed cost, right? Simple. Why? Because break-even point is nothing but that point where my contribution exactly recovers my fixed cost. Nothing less, nothing more. If it is less, then you will be having a loss. If it generates a more contribution, then you will be left with a profit. Exactly at 2,500 units, what you have is you generate a contribution equal to your fixed cost. Suppose I'm selling only 2,400 units, which means if I'm operating below the break-even point, the contribution that I would have generated would not even be able to recover your fixed cost. Suppose if I'm selling above my break-even point, it means after recovering the fixed cost, I have some extra contribution that goes on to build my profit. This way you can clearly analyze. Now over and above my break-even point, how many units have I sold? 3,500 units. The contribution generated by these 3,500 units now goes on to build my profit. 3,500 into how much? 4 rupees. 3,500 into 4. How much is that? 14,000 rupees. So this is going to be equal to my profit. Are you guys able to understand? Or clearly make a very important note of this. My total sales is linked to my contribution, right? Now my break-even point is linked to my fixed cost, and my margin of safety is linked to my profit. Are you all able to understand? So the contribution generated by total sales is going to be the total contribution. The contribution generated by break-even point is nothing but your fixed cost, and the contribution generated by your margin of safety is going to be called as your profit. Are you all clear with this? Now, one more very important thing. Now, these are all ideally your volume levels. This can be expressed in total values also. For example, 6,000 units. If you want to mention in units, it is 6,000 units. If you want to mention it in value, it's going to be how much? 6,000 into 10, 60,000 rupees. I can call this as 60,000 rupees, correct? Similarly, break-even point, sir, 2,500 units, sir. If you want to express this in value, 2,500 into 10, this is going to be 25,000 rupees, correct? Worth of sales. And margin of safety, 3,500 units. If you want to express this in value, it's going to be 3,500 into 10. It's going to be 35,000 rupees, correct? 35,000 rupees, right? Now, very simple, guys. Now, can I say my total sales, right, 6,000 units into contribution per unit gives me my total contribution, or my total sales into value into PV ratio gives me my contribution, right? Now, you can calculate this 60,000 rupees into 40%. Take your calculator and do. You get how much? 24,000 rupees. Or break-even point. In units, break-even point units into contribution per unit gives you fixed cost 2,500 into 4 gives you 10,000. Or break-even point, if it is in value, then use PV ratio into PV ratio 40%, 25,000 into 0.4, how much is it? 10,000 is equal to your fixed cost. Or margin of safety, similarly, in units into contribution per unit, that is 4 rupees, you will get a profit. Or margin of safety into in value into PV ratio 40%, you try and do, you will get what? Profit. Are you guys clear with this? Or in other words, total sales is linked to total contribution, break-even point is linked to fixed cost, and margin of safety is linked to profit. The linking factor is what? The linking factor is ideally your contribution per unit, the contribution per unit, or you can also say PV ratio. It is contribution per unit or PV ratio. Sir, how? Or sir, if these are in units, if these three, the top figures are in units, then the linking factor is contribution per unit. If these are in values, the linking factor is PV ratio. Are you guys able to understand this? Are you guys able to understand this? Right? Now, coming to the discussion of margin of safety. Coming to the discussion of margin of safety. Now, guys, can I say margin of safety once again can be expressed either in units or in value, correct? Now, if you want to express this in units, now I can say simple. One formula is what? Total sales minus break-even point, correct? In this case, how much is it? Sir, totally I've sold 6,000 units. Sir, break-even point is how much? 2,500 units. How many units have I sold over and above the break-even point? 3,500 units. Clear with this, guys? Next, another formula. Now, use this marginal costing jodis. Now, can I say margin of safety into contribution per unit gives me the profit. The profit generated out of these extra units only went on to build my profit, correct? So can I say margin of safety into contribution per unit is equal to profit? Or in other words, margin of safety is equal to profit divided by contribution per unit. Are you all understanding? This 14,000 rupees is a profit that I earned, right? By selling how many units? Sir, every time I sell one unit, I earn a contribution of how much? 4 rupees in our example. So how many extra units have I sold over and above the break-even point to generate this profit of 14,000 is the calculation. So another formula here is going to be what? It is going to be profit divided by contribution per unit. Are you guys able to understand? Every single thing is derived. right? In the marathon itself, I'm deriving so much. In our regular or exam oriented batches, it will be done with much more explanation and other things. Since this is revision, still I want to set the context and I'm doing it for you. Clear with this, guys? Because there might be some students who might not have listened properly, or maybe some freshers who have not at all attended the lecture. Since to set the context, I'm just giving all these explanations once again, so that the remaining part of discussion in this marathon itself will be very, very easy for you to understand. Clear with this, guys? Now, very simple. If you want the figures in value, margin of safety, once again, guys, so the formula, one of the formula is going to be total sales in value minus break-even point in value. Look at this. Total sales in value. How much was that? 60,000 rupees minus 25,000 rupees. If you subtract, you get 35,000 rupees, right? Or another formula is simple. Use this formula, right? Profit divided by, now I want it in value instead of contribution per unit, use PV ratio. One more jodi, no, right? So simple. So margin of safety 35,000 into PV ratio gives me my 14,000 rupees of profit, or profit divided by PV ratio gives me the margin of safety. Are you guys clear with this? So it is going to be profit divided by PV ratio. This is another formula for your margin of safety. As simple as that, guys. This is the power of conceptual learning. Beyond this, you don't need anything at all. That's all about it. That's all about it. Fine, guys. Now, that's about this particular area of margin of safety. Clear with this, guys? And finally, you can arrive at your profit. I think this profit has been arrived at. In this question, how much is your margin of safety? I think we've arrived 3,500 rupees, 3,500 units, or if you want it in value, it's going to be 35,000 rupees. We have calculated all of that. And finally, guys, what is the thing they have asked for? So last one is arrive at the profit. Now, guys, in your study material, so many formulas are there, and students mug it up. No need to mug up formulas. Now, profit, what is the formula? Profit is equal to, one formula I can say, use the marginal costing income statement. Sales minus variable cost is contribution. Contribution minus fixed cost gives you what? Profit, correct? This is one formula. Another formula, use your marginal costing jodis. Can I say profit is equal to margin of safety units? Profit is nothing but the contribution generated by the margin of safety units, or in other words, your margin of safety units into contribution per unit. 3,500 into contribution per unit is 4. This is also equal to your profit, right? So another formula we can say is profit is equal to margin of safety units into contribution per unit, or suppose margin of safety is given in value, multiply that with PV ratio. This way also you can arrive at the profit, right? In this question, you look at it. What is the margin of safety in value? 35,000 rupees into PV ratio. How much was that? 40%. So 35,000 into 0.4. How much you get? 14,000 rupees. As simple as that. You can literally play around with the figures. This is the power of conceptual learning. Clear with this, guys? Just we spent some time and look at the variety of formulas we ourselves can arrive. That's about it. You need not mug it up. You need not mug it up at all. Clear with this, guys? So these are different variants of arriving at the the profit formula. That's about it. Now itself, if you notice, we have covered so many formulas, and the best part is that all these formulas on the spot you can derive and arrive it. You need not take the pain of mugging up anything. The formula construction, we spent about 35-40 minutes right now. With that itself, we are getting this much level of conceptual clarity so that you can arrive the formula by yourself. If there's any kind of sums in this basic level, you will be in a position to handle. Clear with this, guys, right? So that is about the basic concepts covered in this particular chapter initially. So with this, we have covered the revision of income statement, PV ratio, break-even point, margin of safety, and profit. Clear with this, guys, right? Now, let us go on and cover one more small concept called as cash break-even point. Now, guys, what do you mean by cash break-even point? Now, let us take this particular example itself for discussion. Now, all the facts are same. Only one small additional information. Here, fixed cost is given. How much? 10,000 rupees. Now, let us say, out of this fixed cost of 10,000 rupees, right? Example, I'm telling you, depreciation amounts to rupees 2000, which means what? The other component is your cash fixed cost. What do you mean by cash fixed cost? Basically the fixed cost which is incurred in cash. For example, your factory rent, that is an amount I need to pay, right? In cash, it's going to be balancing figure 8,000 rupees. Now your total fixed cost is bifurcated into two. Cash fixed costs, those components of fixed costs which are actually incurred and which needs to be paid to some third parties. Whereas your depreciation, this is also a fixed cost, but this is something that I set aside for my accounting purposes, right? Literally, I would have spent the entire amount, capitalized the value, and based on my period of consumption, based on the period of the life of the asset, I amortize, I apportion it, right? Now, this is an amount I need not pay out by cash. Now, what do you mean by a break-even point? It is that point of sale. How many units should I sell to recover my entire fixed cost? Correct? Now, in this question, we saw, right? It was 10,000 rupees I want to recover, right? So, every time I sell one unit, I earn 4 rupees. Literally, I need to sell 2,500 units so that I will be exactly able to recover this 10,000 rupees of fixed cost. This is what we saw. Cash break-even point means how many units should I sell to recover only the cash fixed cost. I need not recover the full fixed cost including depreciation. So how many units should I sell in order to recover this 8,000 rupees in our example of cash fixed cost? Or in other words, can we say cash break-even point is equal to cash fixed cost divided by contribution per unit, right? Now in this case, I want to recover a total of how much? 8,000 rupees, right? Every time I sell a unit, how much contribution do I earn? I earn 4 rupees, which means how many units should I sell? 2,000 units. If you sell 2,000 units, exactly 2,000 units, each unit will generate 4 rupees of contribution. I will be able to pile up a contribution of how much? 8,000 rupees. From this, subtract your cash, this will be equal to your cash fixed cost. I'll be able to recover my cash fixed cost. Are you all able to understand? Now guys, clearly understand, at cash break-even point, you will not be having your profit equal to 0. You will be having a loss. Sir, how sir? Simple. I will give this particular table and you will be able to understand. Now guys, let us say in our example we saw the break-even point was how much? 2,500 units. And we saw the cash break-even point right now we saw is how much? 2,000 units. Now, at the cash break-even point, how much contribution you would have generated? You would have generated 2,000 into 4, which is equal to how much? 8,000 rupees. However, from my contribution, subtract your fixed cost, 10,000 rupees. Literally, in this position, you will be left with a loss of how much? So, literally, guys, at 2,000 units level, 2,000 into 4, 8,000 rupees is going to be my contribution, minus entire 10,000 rupees of fixed cost. Literally, you will be left with a loss of 2,000 rupees. Correct? Whereas at the break-even point, full break-even point means what? It is so many number of units that I need to sell so that my entire fixed cost of 10,000 rupees is recovered. I am left with 0 profit, 0 loss. So here, literally 2,000 into 4, 2,500 into 4, 10,000 rupees the contribution minus fixed cost 10,000. I am left with a profit or loss of exactly 0. Or in other words, guys, any point operating below the break-even point we know will give you a loss only. Right now, at the cash break-even point, I am selling so many number of units that is exactly able to recover only my cash fixed cost, which means I have still not yet recovered my depreciation. Or in other words, the profit or loss, in this case the loss at the cash break-even point level will be exactly equal to the depreciation, because that is the only amount which I have not yet recovered. Are you guys clear with this? So one small learning objective here, at the cash break-even point, I generate contribution that is sufficient to recover my cash fixed cost, which means I have not yet recovered my depreciation amount, or in other words, at the cash break-even point, in this example, 2000 units, I am left with a loss which is exactly equal to the unrecovered component of your fixed cost, which is nothing but your depreciation amount. Are you all able to understand? At the cash break-even point, the loss is equal to your depreciation because that is the only amount which is not yet recovered. Are you guys able to get this? This is the concept of cash break-even point. Now, literally, guys, with this, we have also covered this concept of cash break-even point. These are all the basic concepts which you definitely need to have in your mind, which you need to know before you can enter into the other areas. That's the reason why I'm giving you guys a background here itself. Right now, all these things I have clearly explained in our concept decoder book. If you open it neatly, a lot of efforts have gone into building these books because these are, as I told you, these are separately available for CA Inter paper 4 cost and management accounting, CMA Inter paper 8 cost accounting, CMA Intermediate paper 12 management accounting. All the books are separate. All the books are separate, neatly done based on the respective study materials. I have done it, and accordingly all these explanations have been given here. Right, this example I gave you with an illustration so that you can understand. Look at this. Selling price per unit is equal to variable cost plus contribution. Correct? Sales minus variable cost is contribution, or contribution plus variable cost is sales. Any which ways you can play around. Contribution per unit is equal to selling price minus variable cost. Everything is explained here. Basic concepts here. So contribution per unit is selling price minus variable cost. Total contribution is sales into PV ratio, or you can say contribution per unit into units sold. You can play around, or sales minus variable cost, or you can say sales minus variable cost is equal to contribution minus fixed cost gives you profit. So contribution is equal to sales minus variable cost, or if you want to reverse work, you can say it is going to be fixed cost plus profit. So contribution minus fixed cost gives you profit. Now if this goes to the other side, contribution is equal to profit plus fixed cost. This way also you can write. Literally you can play around everything I have mentioned here. The background logics is what I just taught you right now. Like this, every single thing, PV ratio, right? The formula, contribution by sales into 100. Right, required sales, we'll be doing it. Now all these things, literally this is also something that we'll be covering in volume analysis. I will just come up right now. So every single thing, cash break-even point, what is the meaning of that? Fixed cost divided by contribution per unit is your break-even sales. Right, if you want it in units, if you want it in value, it's divided by PV ratio. Right, now the break-even sales, you can say it's break-even units into selling price per unit. So cash break-even point is nothing but cash fixed cost divided by contribution per unit, or PV ratio as the case may be. Right, and I've also given this doubt buster clearly. Doubt buster basically is those areas which you can have a confusion. At the cash break-even point, there will be a loss which is exactly equal to your non-cash expenditure depreciation. Every single thing literally has been mentioned here in the concept decoder book itself. Clear with this, guys? So there is nothing beyond this that you need. This is a very good way to actually, once you cover this conceptual explanation, you just go through it once, you will be able to have a full-fledged understanding the day before your exam. You just need to open your concept decoder and go through it once. You will be able to remember every single thing that I taught you. That is the biggest value addition, because all these things have been carefully designed. All the colorings and other things have been designed in such a way that you will be able to recollect all the important parts, whatever I've taught you during this lecture, when you are revising it. So this is a book which you can use both at the time of preparation, same book at the time of revision also. So I've removed all the unwanted content that runs into multiple paragraphs. We have used some AI tools and all to condense everything in a neat presentation manner. And if you notice, all these formulas are mentioned in a separate font, dark purple, right? So that the day before your exam, you can quickly revisit everything. Clear with this, guys? And the logic for all these things through our lectures is what we cover. Now just imagine in the marathon itself, I'm covering all these things. In our exam oriented or regular batches and all, it will be in a much detailed manner, in such a way that we'll be covering so many sums also in the marathon revision. So little bit of sums here also I will cover, but all the sums in detail, all the chapters will be covering in our exam oriented as well as regular batches. Right, guys? Fine. So with this, let us move on to the next concept called as indifference point. So indifference point. Now let's get started with this particular concept. Now guys, we will also do one numerical problem in this particular area, one high level question we will be doing. Now even in the marathon, still it's okay, we will do a high level question. because this will cover this entire concept of indifference point. But before that, quickly, I will walk you through the concept of indifference point with all the formula explanation. We will derive and see everything. So, indifference point. Now, guys, what is this concept all about? Quickly, I will give you guys an example. Now, long ago, right? So now don't think I'm talking about some previous generation, years and decades back. No, a few years back, right? Before 2016, right? Why, sir, 2016 specifically? That was the year when Jio came into this telecom sector. Before that, right? Now, there were multiple players in this telecom sector. Now, they had this concept of prepaid, postpaid. It is still there, but it is not as vibrant as it was before, because Jio has come up with all this unlimited plans. So many people, they don't know the concept of prepaid, postpaid and all nowadays. That's why I started off with saying long ago, master stroke by the Reliance group of companies. Master stroke, they wiped off the entire market, and initially they gave all the SIM cards free of cost and everything, and people were actually making fun. They were thinking, why are these guys doing all this, right? And they thought in India people will use free of cost and then they will not buy. Slowly and gradually he introduced all this paid subscription into the market, and literally they swept off this entire telecom industry. Fine, the case study another part, maybe in a separate video I'll make. But right now, let's take this example of telecom sector to understand the concept of this concept of indifference point. Now guys, let's say you have two models. One is called as prepaid, the other one is called as postpaid, right? Now, in prepaid, generally what you have, in both the models you have a variable cost and a fixed cost. Let me take an example. Suppose if you are opting for a prepaid SIM, they will say, sir, monthly you should pay us a fixed charges of 100 rupees, right? What is this? This is going to be an amount which you pay them because they are retaining your mobile number. Variable cost, for every call you make, let us say you are supposed to pay them 50 paise, right? So which means if you're taking a prepaid SIM, flat 100 rupees every month, irrespective of your calls, you need to pay, plus every call you make, you need to pay them 0.5 rupees. Whereas if you're going for a postpaid plan, every month you need to pay them a fixed charges of 500 rupees. But the advantage here is every time you make a call, per call you need to pay only 30 paise, right? Now guys, prepaid plan, this is the cost model, 100 rupees flat every month plus 50 paise per call. Postpaid, 500 rupees every month plus 30 paise per call. Now you guys tell me, which is more beneficial? Which is more beneficial? Will I go for prepaid or will I go for postpaid? Out of the two, which one is the best? Now, you can't come up with a solution like always prepaid is best or always postpaid is best. Why? Because here we need to choose between two different alternatives, and in prepaid, the advantage is lower fixed cost. Instead of 500 here, it's only 100 rupees. Whereas in postpaid, the advantage is by way of lower variable cost. Instead of 50 paise, here it's only 30 paise, that is 0.3. Or in other words, both these options, alternatives, will have one advantage and one disadvantage each. In this case, you can't directly come to a conclusion saying one particular alternative is always better than another particular alternative. Are you guys clear with this? And this concept of indifference point will come into picture only when you are deciding to choose between either of the two alternatives. Between choice of multiple alternatives, only then will you have a concept of indifference point. By the way guys, this chapter goes on to achieve the objective of decision making. Here in this chapter, throughout we are going to take decisions, right? So that is the most important thing that you need to have in mind. Ideally, I should have told this before. This chapter has an objective of decision making, right? And by the way guys, now our subject, right, cost and management accounting, overall it has three objectives. One is your stock valuation and profit computation. The second objective is decision making. The third objective is control. Right? Now, this chapter helps you achieve the objective of decision making. Every single chapter has its own objective, either of the three objectives. This chapter has the objective of achieving your objective B, the second objective, decision making. However, in one area alone, that is in this concept called marginal costing versus absorption costing, we will also be seeing in this concept alone, it goes on to achieve the first objective, stock valuation and profit computation. This particular segment alone. Everything else in this chapter goes on to achieve your decision making objective. Now coming back here, guys. Coming back here. Now, sir, prepaid is better or postpaid is better? You can't come to a conclusion like that, because each of these two alternatives have one advantage and one disadvantage each. Now, but can I say there will be one point when both the alternatives will give me the same cost, same result. Now guys, you all think practically and tell. Let us say you are a missed call party, a conjuice party, right? So you will not make much of calls, you will only make missed calls. Literally, you want a phone number, for that only you actually subscribe to either prepaid or postpaid SIM, right? You will not make much of calls. If at all, you make only at emergency purposes, right? Beyond that, you will not make. In that case, you tell me, will you go for a prepaid SIM card or will you go for a postpaid SIM card? Now, clearly you will go only for prepaid. Why? Sir, my volume is not less, so I need not commit 500 rupees. Prepaid, I need to commit only 100 rupees. If I make a phone call, only then 0.5 rupees I need to pay. Maximum, sir, my volume is very less, I will not make many phone calls and all. In that case, overall, your significant component of your cost is driven by your fixed cost. So you will go for that option that gives you a lower fixed cost. Generally, when your volume is less, you will go for that alternative that gives you a lower fixed cost. Suppose, let us say, now you are a businessman and you need to make a lot of phone calls every month. Now here, you don't mind paying this 500 rupees, but every time you make a call, your volume is very high. Instead of paying 0.5, you just need to pay 0.30. So if your volume is very high, now overall cost comprised of fixed plus variable. If your volume is huge, then generally the variable cost will be actually, the compensation of variable cost will be more. Hence, you will go for that alternative which gives you a lower variable cost per unit. In this case, if you are a person who makes multiple phone calls every month, you will go for a postpaid option, because that will give you overall lower cost. Clear with this, guys? But there will be one point of volume where the total cost under prepaid will be exactly equal to the total cost under postpaid, and that volume at which the total cost under both the alternatives are equal is called as indifference point. Are you clear with this? Indifference point means what? I am not different to either alternate A or alternative B, because both the alternative gives me the same result. The point of volume at which these two alternatives gives the same total cost is called as indifference point. Clear with this, guys? So now, how will I get this, sir? Simple. Let us keep this indifference point. Indifference point is nothing but volume as X. Now, what will be the total cost of prepaid? Can I say the total cost of prepaid will be 0.5x plus 100, correct? Now at the indifference point, this has to be equal to the total cost arrived under postpaid. What is the total cost of postpaid? 0.3x plus 500, right? Now take x on one side, I will say 0.5x. Now this comes to the other side, becomes minus 0.3x is equal to 500 minus 100. Correct? So I have 500 here, 100 comes to the other side, it becomes minus 100. Clear? Now take x out in common. Can I say this is nothing but x into 0.5 minus 0.3 is equal to 500 minus 100, or in other words, x is equal to 500 minus 100 divided by 0.5 minus 0.3. This is nothing but 400 rupees divided by 0.20. So 400 divided by 0.2 is equal to how much? 2000. Right, 2000 units, or in this case it is not units, it is 2000 calls. Or in other words, if I am going to exactly make 2000 calls every month, then either if I go for prepaid or if I go for postpaid, both the alternatives will give me the same result. Clear with this, guys? Suppose your expected volume for the upcoming month is less than 2000 calls. If I am a person who is going to make less than 2000 calls, then I will go for that alternative. My volume is less, I will go for that alternative that gives me a lower fixed cost. I will go for prepaid. Suppose if my expected volume in the upcoming month is more than 2000 calls, right? In that case, I will go for that alternative that gives me a lower variable cost. I will go for postpaid at 2000 phone calls. In this case, what will I do? It is an indifference point. I am not different to either of the two alternatives because both the alternatives will give me the same result. Are you guys clear with this, right? This is the concept called indifference point. Or in other words, guys, how do we calculate indifference points? Very simple. Now look at this here, look at this. 500 minus 100 by 0.5 minus 0.3. So 500 minus 100 is nothing but difference in fixed cost, correct? This is nothing but difference in fixed cost divided by, now what is this? 0.5 minus 0.3. 0.5 minus 0.3 is nothing but difference in variable cost per unit. Are you all able to understand? Are you all able to understand? Or in other words, I will say indifference point is equal to difference in fixed cost divided by difference in variable cost per unit. If I arrive at this, I will get what? The indifference point. Sir, with the help of indifference point, what can we do? Simple, guys. With the help of indifference point, let us say in this case, indifference point is 2000 calls. Right? In this case, it is calls. Suppose if we are talking about a manufacturing company, it will be 2000 units, for example. Simple. With this, sir, what decision can I take? Simple. Now, sir, 2000 units is going to be your indifference point. Now, suppose in the next month, you have your expected demand is less than 2000 units. What will you do? You will go for that option which has a lower fixed cost. Suppose in the upcoming month, your expected demand is more than 2000 units. You will go for that option which has a lower variable cost per unit. Clear with this, guys? And sir, exactly it is going to be 2000 units. It is called as indifference point. Whether you go for alternative 1 or you go for alternate 2, in either of the two alternatives, it is going to give you the same result. In this case, I am going to make 2000 phone calls exactly. Whether I go for prepaid or I go for postpaid, it doesn't make any difference. Suppose I'm a person who is going to make less than 2000 phone calls every month, then I will go for prepaid option. Why do I go for prepaid option? It is the option which has a lower fixed cost. Whereas if I'm going to make more than 2000 phone calls, I'll go for postpaid option because it has a lower variable cost per unit. So I'll go for postpaid here. Are you all able to understand this, right? So just if you calculate this indifference point, one look at the expected volume for the upcoming month, now upcoming period, you can say, sir, I'm going to make 5000 units, sir. Go for postpaid. Why? Lower variable cost per unit, right? Over and above my, it is lying below, it is lying beyond my indifference point. Sir, I'm going to sell only 500 units, sir. Go for prepaid. One look at the volume, you can directly say which alternative is going to be better for you, and the deal breaker here is going to be your indifference point. For that purpose only, we have computed this indifference point. Are you all clear with this? How do I compute indifference point? Difference in fixed cost divided by difference in variable cost per unit. I proved this formula and showed it to you. As simple as that, guys. You need not even mug this up. Clear with this, guys? So by one look at the expected output for the next period, you will be able to clearly tell which option is going to be working out for you. Are you all able to understand this? Yes. Now, sir, now in this case, if you notice, here we have 100 rupees of fixed cost. Here we have 500 rupees of fixed cost. Right? Now, out of these two alternatives, which one has a lower fixed cost? Obviously, your prepaid. Correct? And here the variable cost is 0.5. Here the variable cost is 0.3. Out of these two alternatives, which has a lower variable cost per unit? Absolutely postpaid. Clear with this, guys? So if my volume is more, right? I will go for postpaid. More means what? Beyond 2000 units, 2000 calls, right? If my volume is less, what do you mean by less? That is, my expected volume is only less than 2000 phone calls, then I will go for prepaid. One look at this itself, you will be able to understand. For example, if I am going to make 1000 phone calls, lies below indifference point, prepaid will be better for you, right? If you want, you can check and also calculate. So 1000 phone calls means how much will be the total cost under prepaid? 0.5 into 1000, that's going to be 500 plus 100, it's going to be how much? 600 rupees will be the total cost under prepaid. If I go for postpaid, how much will that is that going to be? It is going to be 1000 into 0.3, that's going to be 300 variable cost. Fixed cost is how much? 500. Overall, it's going to be 800. Clearly, if you notice, now your prepaid is cheaper than postpaid. Why? Because the expected volume lies below your indifference point. Like this, you can take one example of, let us say, 3000 phone calls and try. Obviously, postpaid will give you a lower cost than prepaid. There you will say postpaid is better. So here, now, there is no one best alternative. It depends on the volume. It's all about the volume game in this entire chapter. Clear with this, guys? So this is the concept of indifference point, where you can calculate it using this formula: difference in fixed cost divided by difference in variable cost per unit. Now let me add one more extra information here. With that one more formula we can cover for this indifference point. Let us say I am running a call center, right? And let us say ICICI Bank has hired me, right? I run a call center. ICICI Bank has hired me and they have told, right? Now I will give you one database which has a list of all the phone numbers of almost all the citizens in this country. Now your duty, the call center's duty, is to call every person and disturb them. Ask them whether they want credit card, debit card, whether they want to open a bank account, loan account, whatever it is, right? Now, what ICICI Bank tells me is that, or HDFC Bank, whatever bank it is, they are telling me, for every phone call you make and disturb, I will pay you 1 rupee. Clear with this, guys? Now, they are not bothered whether me, the call center, is using a prepaid or a postpaid SIM card. Clear with this, guys? This is the scenario. Now, in this scenario, how will the cost figures look like? Now, guys, we have what? Prepaid plan. We have postpaid plan, right? Now, you guys think and answer. Whether I use a prepaid SIM or I use a postpaid SIM, how much is the amount I will be getting from the bank? 1 rupee. This is the selling price. We are calculating this from the perspective of the call center, right? Whereas, how much will be the variable cost? If I use a prepaid SIM, we calculated the variable cost was slightly higher, 0.50. Whereas postpaid SIM, it was only 0.30, correct? Now, how much is going to be the contribution per unit, or in other words, contribution per phone call? Here we'll say one phone call is 1 unit. Here, if I use prepaid, it's going to be 0.50. If I use postpaid, it's going to be 1 minus 0.3. It's going to be how much? 0.70. Clear with this, guys? Now, how much is the fixed cost? Now, sir, if I use a prepaid SIM, the fixed cost is only 100. Whereas, if I use a postpaid SIM, how much is going to be my fixed cost? My fixed cost is going to be 500 rupees. Are you clear with this? Now, in this case, which alternative is better? Same situation. Now, option A, that is your prepaid, has an advantage. What advantage? Lower fixed cost. Whereas postpaid, what advantage it has? It has a higher contribution per unit. Are you all able to understand? Now, guys, this is nothing but lower variable cost results in higher contribution per unit. No, because my selling price was the same. Selling price minus variable cost gives me contribution. Postpaid had a lower variable cost, which in turn resulted in a higher contribution per unit. Agreeing with me on this? So literally what I can say, prepaid has an advantage of lower fixed cost, postpaid has an advantage of higher contribution per unit. Which is better? You can't directly say like that. Then you need to compute your indifference point. In this case, once again, guys, if your volume is lesser, you will go for that alternative which has a lower fixed cost. If your volume is more, you will go for that alternative which has a higher contribution per unit. But there will be one point where the profit under the first alternative will be equal to the profit under the second alternative. This point of volume is called as indifference point. Now in that case, the profit under two alternatives should be equal, right? So now let's compute that. Now how do we do it? Simple. Let's take the volume as X. In that case, tell me what will be the profit under prepaid plan. The prepaid plan profit is going to be 0.5x, correct? Contribution 0.5 into X is the number of units which we need to compute, indifference point, minus contribution minus fixed cost 100 rupees, right? That's going to be the profit under first alternative should be equal to 0.7x. This is going to be the contribution under the second alternative minus 500 rupees, right? So now what we need to do, so now we just need to take X on one side and the fixed cost on the other side, the values on the other side. So can I say this 500 comes to the other side, minus 500 becomes 500. So can I say 500 minus 100 is equal to 0.7x minus 0.5x. So here we have 0.7x and this 0.5 goes on the other side, it becomes a minus 0.5, right? So now how much will this be? How much will this be? So this is going to be, once again I'll take X common out here. So I will say X the whole into 0.7 minus 0.5 will be equal to 500 minus 100, or in other words, X is equal to 500 minus 100 divided by 0.7 minus 0.5, right? Here literally X is equal to 500 minus 100 divided by, this comes to the denominator, 0.7 minus 0.5, right? So now I can say, or this is nothing but this is equal to 500 minus 100 is 400 divided by 0.7 minus 0.5 is going to be 0.20. So 400 by 0.2 gives me how much? 2000 units, or in other words 2004 calls. In this case, how did we compute 500 minus 100? 500 minus 100 is nothing but difference in fixed cost, correct? This is nothing but difference in fixed cost. And 0.7 minus 0.5, so 0.7, this is nothing but difference in contribution per unit. This is nothing but what? Difference in contribution per unit. Or in other words, I can say indifference point is equal to difference in fixed cost divided by difference in contribution per unit. Are you guys able to understand? This is another formula for your indifference point calculation. See how logical it is. Now sir, with this what can you come to a conclusion? Simple. So now I have an indifference point. How much is my indifference point? It's going to be 2000 units, in this case 2000 phone calls. If my expected volume is less than the indifference point, I will go for that alternative which gives me a lower fixed cost. If my expected volume is more than the indifference point, I will go for that option which gives me a higher contribution per unit, or in other words lower variable cost. Because of lower variable cost, you will have a higher contribution per unit, because at the end of the day, selling price minus variable cost is only contribution per unit. If your contribution is less, if your variable cost is less, contribution will be more. As simple as that. Clear with this, guys? In this case, under the first alternative, lower fixed cost, hence I will go for prepaid plan. So if I am a person who is going to make less than 2000 phone calls, go for prepaid. That will always give you the highest amount of profit. Whereas if you are a person who makes more than 2000 phone calls, go for the option which has a higher contribution per unit, which is nothing but your post-paid plan, because that will give you the highest amount of profit. Are you guys clear with this? And at exactly, if you're going to make 2000 phone calls, whether you go for prepaid or you go for postpaid, both will give you the same amount of profit. Are you guys able to understand? This concept is called as indifference point. So two formulas we saw here. What are they? Indifference point is equal to difference in fixed cost divided by difference in variable cost per unit, or it is nothing but difference in fixed cost divided by difference in contribution per unit. Clearly understand, difference in variable cost, how much is it? 0.5, 0.3. The difference is how much? 0.2. And the difference in contribution, how much? 0.5, 0.7. How much is it? 0.2 only. So obviously when my selling price is the same, the difference in fixed cost, the difference in variable cost is equal to difference in contribution per unit. Are you guys clear with this? Here my contribution was 0.5, 1 minus 0.5. Here, what is the contribution? It is 1 minus 0.3. How much is it? 0.7 rupees. Clear with this, guys? Now, literally, why did this happen? Simple. From the same 1 rupee, here I'm subtracting 0.5. Here I'm subtracting 0.7. So literally, this difference in contribution per unit of 0.2 is clearly because of this difference, variable cost difference, which is 0.2. So literally, guys, the difference in variable cost is equal to difference in contribution per unit when my selling price is the same. Clear with this, guys? That's why it can be calculated using two different formulas: difference in fixed cost divided by difference in contribution per unit, or difference in fixed cost divided by difference in variable cost per unit. Are you guys clear with this? So why do we use this indifference point? At the indifference point, you can use either of the two alternatives, but if your expected demand or the volume is less than the indifference point, go for that option which gives you the lower fixed cost. Always mention the advantage, right? If your expected volume is more than your indifference point, go for that option which gives you lower variable cost per unit, or you can say, in other words, higher contribution per unit. Are you guys able to understand? This is all about the concept of indifference point. Now, with this in mind, let us go and do one numerical problem. This sum is as per our CA intermediate. It is in our CA intermediate. I have kept it in our solved question bank. This is very much applicable even for CMA paper 8 and paper 12 students. You guys can also use it. It is not something out of syllabus. Absolutely. If there is something that is not applicable, I will clearly tell you. So here the reason why I'm merging the marathon is because this is very much applicable for you guys. Right? That is the reason why I'm doing it. But please remember, all our courses and all are separately recorded. Even P8 and P12, I don't merge. Every single thing is separate only. Clear with this, guys? On this note, please take our solved question bank. This is in volume 2. This is our solved question bank looks like. This is CA intermediate solved question bank. So you can download all the materials I'm using here. You can download it from our website free of cost. All these things are available, right? In case you want a hard copy, that you can buy. We are just recovering whatever is the printing cost and the courier cost and other things. But if you want, you can even download this free PDF and use it. Now, please take this question number 12. It's on page number 412. It's in the volume 2. So please take this question. Right. So now, let me just read this question. It's a high-end question, high-level question. With this question, the entire concept of indifference point can be covered very, very easily. Now, guys, what are they saying? The following are the cost data for 3 alternative ways of processing clerical work for cases brought before LC court system. There is a court like magistrate court or high court. They are saying there are 3 different ways in which they can process some clerical work. Some files are all coming, so they need to process the files. So there are 3 different ways in which they can process the files. One is called as a manual way. Then the second option is called semi-automatic processing. The third one is fully automatic. 3 different alternatives are there. Now, what have they given? Particulars: monthly fixed cost, occupancy, maintenance contract, equipment lease. Now, if I'm going for manual, there is only one fixed cost, 15,000 rupees. Second alternative, if I'm going, I have 15,000 plus 5,000 plus 25,000. 3 different fixed cost I have. So literally, what is the total fixed cost? Let us keep this as alternative A. We will keep this as alternative B. We will keep this as alternative C. Each of the 3 alternatives tell me how much is the fixed cost. Manual, that is alternative A, fixed cost is 15,000 rupees. Alternative B, how much is the total fixed cost? 15 plus 5, that is 20,000. 20 plus 25, it's going to be 45,000 rupees. Right? So it's going to be 45,000. And alternative C, fully automatic, 15 plus 10,000 plus 1 lakh, it's going to be 1,25,000. This is going to be what? The total fixed cost under the third alternative. Fine, guys. Now, they have also given us the unit variable cost. 1 unit is 1 report. Clear with this, guys? Now, per unit or per report, what is the variable cost? Here, there are 2 different variable costs here. Supplies, labor. Simple, add the 2. Alternative 1, my variable cost is going to be 40 plus 200. How much is this? 240 rupees is my variable cost. Alternative 2, 80 plus 60. How much is it? 140 rupees. And alternative 3, 20 plus 20. How much is it? 40 rupees. Clear with this, guys? Now, what we need to do, for every alternative, we have the total fixed cost, total variable cost. Like that, for each of the 3 alternatives, we have the fixed cost, variable cost. Now they're asking, calculate the cost in different points and interpret your results. And part number 2, if the present case load, which means the number of files, is 600 cases and is expected to go up to 850 cases in the near future, select the most appropriate option, that is alternative, on cost consideration. They are saying, if I have a total of 600 cases, one case is 1 unit, so 600 cases means which is the best alternative. Suppose if I'm going to have 850 cases or 850 units is going to be the volume, in that case, which is better? Now guys, first of all, in whatever I have taught you till now, we have seen clearly indifference point is nothing but difference in fixed cost divided by difference in variable cost per unit. Sir, we had only 2 alternatives, sir, but in this particular question, if you see, we have 3 alternatives. How can we do this question? Now, simple, guys. Always remember, indifference point calculation can be solved only by taking 2 alternatives. In this case, what we need to do, we need to take 2 different alternatives at a time and take up all different combinations. For instance, first, A and B. Calculate indifference point of A and B. Then calculate indifference point of A and C. Then calculate indifference point of B and C. Right? So 3 different indifference point we need to calculate. AB, AC, BC. 3 different indifference point. First we need to calculate. And once we calculate this, then we need to interpret the results. Clear with this, guys? Now, the first part of the question is fairly simple. Calculation of indifference point. So AB, AC, BC, 3 different indifference points we need to calculate. Once we calculate this, then, sir, we will be having 3 different indifference points. With this, sir, what do we do? Right? I will tell you what needs to be done. Clear with this, guys? Let's quickly do this particular question here. Okay, the solution is given here. But anyways, I would like to do this question in detail. So it's going to be, let me just put it up here. This was question number 12, right? So question number 12 from our CA intermediate. Right, guys? Now, so first let me list out the options we have. Option A, option B, option C. That is your manual, semi-automatic and fully automatic. Then you have variable cost and you have fixed cost. How much was our variable cost? Now I'm just putting it up here. It was rupees 240, rupees 80 plus 60 was 140, and then rupees 20 plus 20, it was 40, right? Just now we calculated all of this, 240, 140 and 40. And about the fixed cost, 15,000, 45,000 and 1,25,000. I'm putting it up here. It was 15,000, then we had 45,000, and then we had 1,25,000, right? So I think this is what we had. Yes, 1,25,000. Now, what do we need to do? We need to compute the indifference point separately for each of the 3 different possibilities. AB first, then AC next, then B and C. Right? In whichever order you want, you can calculate. So indifference point for A and B. First I'm doing. Now guys, we know the formula for indifference point. What is the formula for indifference point? It is basically difference in fixed cost divided by difference in variable cost per unit. So in this case, indifference point between A and B, difference in fixed cost, 45,000 minus 15,000. How much is the difference? It is 30,000 rupees divided by how much the difference in variable cost, 240 minus 140. How much is that going to be? 100 rupees, right? Divided by rupees 100. So how much does it come out to? 30,000 divided by 100. Just remove 2 zeros. That's about it. It's going to be how much? 300 units. Clear with this, guys? Clear with this, guys? Basically, what is the meaning of that? Now, exactly at 300 units, or in this case, the court, if it gets 300 cases, whether you go for A or you go for B, both will give you the same result. Suppose if your number of cases is less than 300, go for that alternative which gives you a lower variable cost. Which one? This one. Sorry, if it is less than your indifference point, you go for that alternative which gives you a lower fixed cost, which is alternative A. Suppose if your number of cases is going to be more than 300, you will go for that option which gives you a lower variable cost per unit. You go for alternative B. Are you guys clear with this? This is what we need to do. Yes, we will come back to that later. Next one. Next is indifference point calculation for A and C. Let's do this. Once again, indifference point is equal to difference in fixed cost divided by difference in contribution per unit. Now A and C. What is the difference in fixed cost? Here 1,25,000, here you have 15,000. The difference 1,25,000, 15. How much is the difference? It is going to be rupees 1,10,000 divided by how much the difference in variable cost? 240. Here you have only 40 here. The difference is going to be 240 minus 40, rupees 200. Or in other words, 1,10,000 divided by 200. How much is it? 550 units. Or in other words, 550 cases is my indifference point. If my expected volume is less than 550, right, you will go for that alternative which gives you a lower fixed cost. Go for A. If it is more than 550, go for that option which gives you a lower variable cost per unit, which is going to be option C. Clear with this, guys? This is the interpretation. Next, we need to calculate indifference point between B and C. This is the last alternative. What is this, guys? What is this? Here, once again, indifference point is equal to difference in fixed cost divided by difference in variable cost per unit. We're talking about what and what? B and C. What is the difference in fixed cost? 1,25,000 and 45,000. How much is the difference? 1,25,000 minus 45 gives you 80,000, right? So it's going to be rupees 80,000 divided by how much is the difference in variable cost per unit? 140 minus 40 is going to be rupees 100. How much is this, guys? It's going to be 80,000 divided by 100. It is going to be 800 units. Clear with this, guys? What is the meaning of that? So if I'm planning to have an output of exactly 800, you go either for B or C. It doesn't make a difference. If your expected demand is less than 800 units, you go for that option which gives you a lower fixed cost. Which one? Go for B. If your expected demand is more than 800 units, go for that option which gives you a lower variable cost per unit. You go for C. This is the interpretation. Now, sir, I have three different alternatives, A, B, and C. Because of that, I have three different indifference points. Now, sir, with this, how can I arrive at a proper conclusion? Now, let me clearly put this on a line and clearly explain what it is. This explanation is not there in your study material also, but based on this only they have arrived at the answer. Now look at this. Look at this, guys. Now plot this on, let me plot this on a graphical presentation. The first indifference point is what? 300 units, right? So the first indifference point was at yes, 300 units. Perfect. The next indifference point happens at 550 units. Okay, let me put it up here. It's going to be 550 units. And the next indifference point comes in at 800 units. Let me put it here. It's going to come at 800 units. Now 300 units is the indifference point between A and B, correct? I'm plotting it here. This is between A and B, right? Next, 550 is the indifference point between A and C, correct? A and C. And 800 is the indifference point between B and C. Now, we have plotted everything on this graph. Now, clearly, let us settle the score. Now, sir, 300 units, at 300 units, exactly if my demand is going to be 300, you can either go for A or you can go for B, right? Now, If it is less than 300, now we are just talking about A and B, you will go for what? The one with a lower fixed cost, which is A, correct? So here I will say, if I'm going to operate at less than 300 units, I will go for what? A. More than 300 units, I will go for what? B. Correct? This is the meaning of that, because it has a lower variable cost per unit. B has a lower variable cost per unit between A and B. Next is the clash between A and C. At 550 units level, exactly 550 units, sir. Either go for A or you go for B. But sir, below 550, now which one will you go? We're talking about what? A and C. Between A and C, if my volume is less than my indifference point, I'll go for that option which gives me a lower fixed cost. I will go for what? A. Right? So here, less than this, I will go for A, as per this indifference point between A and C. So more than 550 units, I will go for C. Why? Because between these two, A and C, it has a lower variable cost per unit. Next, the last indifference point, 800 units, B and C. Now, if my expected volume is going to be less than 800 units, I will go for that option which gives me a lower fixed cost. Between what? Sorry, this is between B and C. B and C. Which one has a lower fixed cost? This one, right? So I will go for B. Correct? More than this 800 units, I will go for C because it has a lower variable cost per unit. So here I will say go for B. Beyond this, you can go for option number C. Clear with this, guys? Now, this is how each of the three indifference point comes to a conclusion. Now understand one thing. What is the issue here? Less than 300 units, you have only one player, A. Always A is best. More than 800 units, always C is best. There is no problem here. The problem arises only in this region, that is between 300 units to 800 units. Why? Look at this. As per this indifference point A and B, more than 300 units, they have nominated whom? Option B. Whereas, as per this indifference point between A and C, less than 550, they have nominated whom? A. Or in other words, between 300 and 550, which is better, B or A? As per this indifference point, they have nominated B. As per this indifference point, they have nominated A. Sir, which one is better, sir? There's a confusion once again. Correct? Right? Similarly, in this scenario also, as per this indifference point, more than 550, they have nominated C. Here, less than 800, they have nominated B. Which means, sir, for this range, should I select C or should I select B? This is one issue. There is a clash. Right? Now, how will I resolve this conflict? Very simple. Now, first, guys, now for this range we will talk. Who are the nominees for this range? Right? B and A. Correct? The nominees for this range are B and A. Now, guys, between B and A, whatever was the conflict was clearly clarified here only. Right? Between B and A, in this case, this was nominated between A and C. Because of that, A came into this picture. Correct? Now, once again, we are having a conflict between B and A. Go down and check A and B. Between these two guys, where the indifference point clarification happened here. Now, clearly between A and B, we already found out anything beyond 300, B should only come. A should not interfere there because A's territory is below 300. Clear with this, guys? Whenever you have a conflict on the top, go refer between these two where the indifference point was actually calculated. It is calculated here. Now, what does this say? Sir, above 300 units, go for B, not for A. Hence, what I will do in this case, so obviously A will not come in this area, only B will come into picture. Are you guys clear with this? Why this conflict was resolved in this scenario? Once again, don't create a conflict because of another indifference point. More than 300 units between A and B, only B should come. Sir, once again, because of another indifference point, A has come back, sir. No, this area is actually clarified by this fellow. Are you all able to understand this? So only B will come. Next, in this area, the conflict is clashes between where? C and B. So between C and B, Where did we compute the indifference point? Where was this conflict resolved? Sir, C and B, or B and C, it was actually resolved here, sir. Right? So once again, because of this indifference point, C got nominated here. But as per the indifference point between C and B, or B and C, as the case may be, less than 800, if there is a clash between C and B, always B should only come, because this conflict was resolved here. So less than 800 units, only B should be nominated. This was clarified as per the indifference point clash between B and C. So here what I will do, C will not come. In this case, once again, B is only selected. Or in other words, if at all you want me to build a range and tell me, sir, when to go for which alternative, I will clearly say this is the final conclusion. What we will say is, if your expected demand or the number of units, in this case, in the court, number of cases, if it is less than 300 cases, always go for option A. At 300 units or cases, you can either go for option A or option B. Now, this itself is not relevant because this entire place is ruled by B, right? Now, more than 300 cases up to less than 800 cases, it is always B. Clear with this, guys? Always, if you check, B will give you the least total cost. At 800 units or 800 cases, you can either go for B or C, because both of them will give you the same cost. Now, if your number of cases or volume is more than 800 units or 800 cases, C, it's better to go for C, because that will always give you the best, least possible cost. Are you guys able to understand? So in this question, a high level question, why we calculated 3 indifference point, and there were a clash between multiple indifference points. So we also saw how to resolve this conflict. Are you guys clear with this? So this is the one line summary of this particular area, of this particular question: volume and decision. If your expected volume is less than 300 units, go for A. If your volume is exactly equal to 300 units, you go for what? You go for A or B. If your volume is, I'm putting my volume here, if your volume is greater than 300 units but less than 800 units, right? Then look at this. I'm talking about this range. Sir, 550 will not come. No. What is the point of keeping 550 here? Because less than 550 B, more than 550 once again B. So there is no point at all. So the conflict got resolved here. So this is never one threshold point at all for you. Clear with this, guys? This entire place is ruled only by one particular alternative B. So it's going to be B. Now, if your volume is exactly equal to 800 units, you come here, it is either B or C. And if your volume is expected to be greater than 800 units, always go for this particular alternative. Clear with this, guys? Clearly, if you build the range now, you just name your expected output, that will give you the least possible total cost. Clear with this, guys? So with this, one look at this range itself, you will be in a position to come up with the correct answer out of the 3 alternatives, sir. Which one is best? Directly you can say. Now in this question, what have they mentioned? In this question, at present, they have a caseload of how many units? 600 units or 600 cases. Go back here and check here. So 600 means, where does it fall? It falls in this range. 600 falls more than 300 but less than 800. Clearly, option B will give you the least total cost. You yourself can check and calculate. Clear with this, guys? The answer will be that. Look, this is what they have done. Less than 300 cases, it is A. Ideally, it's not correct fully, because at 300 it is either A or B. They have not computed the indifference point. The second one, if you see, 300 to 800 only they have taken. In between, we had this 550 that was not considered. Many students are struggling to understand, sir, why, sir? This is also an indifference point. The conflict resolution is not clearly mentioned in the study material. Final answer they have just given, but clearly understand this is how it needs to be done. Clear with this, guys, right? So look at the range. 300 is one threshold. The next threshold is only 800. Right? And after that, so it's going to be less than 300, at 300, greater than 300, less than 800, at 800, above 800. Clear with this, guys? So now, in this particular question, your answer lies between 300 to 800. Hence option B, alternative B, will give you the least total cost. Clear with this, guys? So it gives you the least total cost. Present case load is 600, therefore alternative B is best. That's all. Answer is done. That's all you need to write. Suppose, sir, our cases are expected to go up to 850 units. In that case, which one will you go? 850 means above 800. You go for alternative number C. Clear with this, guys? Have a look at this. You go for alternative number C. Clear with this, guys? That's about it. So this is what they have mentioned. As the number of cases expected to go up to 850, alternative C is more appropriate. One look at this range table, you will be in a position to clearly say, sir, this is the output. This is going to be the best alternative for you. If you want, you can check and compute out of the 3 alternatives, whichever alternative I'm telling you as the answer will give you the least possible cost. Clear with this, guys? But in your study material, as well as in your past exam searched answers, directly they have given this range. Many students struggle to understand how to build the range. Clearly, I've told you right now, this is how you need to build the range by resolving the conflict. Are you guys clear with this? Right? With this, we have completed this particular question. So this I wanted to cover. This is applicable even for CMA students. Please don't think it's not applicable for you. It's a high-end question, one single question. I'm handpicking certain comprehensive questions. I'm doing it so that your entire revision is going to be super comprehensive. So please go and update your library of adjustments. Write down. Please give the cross-referencing and all. Write down indifference point hyphen indifference point hyphen calculation of 3 IDPs for 3 different alternatives, semicolon, range building. So calculation of 3 indifference points for 3 different alternatives, semicolon, range building. We saw the conflict resolution, how to build the range and all that. A very good question to revise this entire concept of indifference point. It has been coming in a lot of exams, past exams as well, both in CA as well as in CMA intermediate level. Clear with this, guys? So with this, we have finished this particular question, and with this, we have also quickly revised this entire concept, right? Not quick, in fact, we've done in a very elaborate manner as well. Now, with this, we are done with the concept of indifference point. Now let's move on to the next concept called as volume analysis. Now what is this concept all about? Quickly, I'll just give you guys an example, and with that we will also revise this particular concept of volume analysis. So volume analysis, what is this about? The explanation, everything has been neatly mentioned here. Volume analysis and all, clearly I have mentioned separately. Indifference point, look at this, volume analysis. Whatever is the formula mentioned, all these things are here. But how do you arrive? What is the underlying concept here? This is there in our concept decoder. For you to understand the logic, I'm quickly recapitulating here. In our courses, we do it in a much more elaborate manner. Since this is a revision, there is a time constraint. Even here, I'm trying to maximize out of the limited time available. Let's quickly get started here. Now guys, let me just take an example. Our signature style of learning, always we take up examples that, even the complicated things can be easily understood. Now, let us say our selling price is 10 rupees, right? Your variable cost is going to be rupees 6. Your fixed cost is going to be rupees 10,000. Just an example, right? Now, I'm going to prepare an income statement for 2 different levels of output. First, I'm going to prepare an income statement for 5,000 units of output. Then I'm going to prepare another income statement for 7,000 units of output, right? Now, let us take this example. Now, what's your format of income statement and marginal costing? Come on, tell it along. Sales minus variable cost gives you contribution minus fixed cost gives you profit, right? Now, what's going to be your total sales? 10 rupees per unit. So 5,000 units means sales of 50,000, and 7,000 units means 70,000 rupees of sales. What's going to be a variable cost? 6 into 5,000, that's going to be 30,000. And here it's going to be 6 into 7,000, that's going to be 42,000. Right? Next, what's going to be a contribution? It's going to be what? 10 minus 6, 4 rupees is the contribution per unit. So 4 into 5,000, it's going to be 20,000. And here it's going to be how much? So 4 into 7,000, it's going to be 28,000. Right? Or you can even say 70,000 minus 42,000. That way also you can arrive. It's going to be 28,000. Next one. Fixed cost, in both the cases, it's going to be 10,000, 10,000. Right, guys? Now, what's going to be the profit here? 20,000 minus 10,000, going to be 10,000. And here it's going to be 28 minus 10, it's going to be 18,000. Sir, this is something we know, no, sir. Why are you doing this particular example? I mean, why are you giving all this scenario? Now, one small observation. At 5,000 units level, how much was the contribution? 20,000 rupees. At 7,000 units level, how much was the contribution? 28,000 rupees. My contribution has increased by how much? 8,000 rupees. Correct? My contribution has increased by how much? 8,000 rupees. Now, or in other words, this contribution increase 8,000. Right? Now, if you carefully observe, at 5,000 units level, what was your total profit? 10,000. At 7,000 units level, how much was your total profit? 18,000. Now, guys, in this case, your profit has increased by how much? 8,000 rupees. Conclusion, can I say? The difference in profit is purely on account of the difference in contribution. Agreeing with me on this. Agreeing with me on this. Sir, overall, my profit increases purely because of the increase in contribution. Absolutely. What do you mean by profit? Contribution minus fixed cost. Here, fixed cost has not changed. So clearly, the change in my contribution is exactly equal to the change in my profit. Are you guys understanding this? Or in other words, can I say the change in profit is exactly nothing but the change in my contribution. Sir, this 8,000 rupees, sir, why it has increased? There's nothing but the contribution. Increase in contribution. Sir, why has my contribution increased? Because, sir, now I am not selling 5,000 units, I am selling 7,000 units. Or in other words, here I have increased my volume by 2,000 units. Or in other words, the contribution pertaining to this 2,000 units is only the increase in my profit. Are you all understanding this? So, guys, one small summary here. The increase in profit is purely on account of increase in contribution. Why is there an increase in the contribution? Because there is an increase in the volume. So contribution per unit remains to be the same, but your overall volume will, because the overall increase in the volume, sir, for every unit I'm earning a contribution of how much? 4 rupees. Now from 5,000 units, now I'm jumping to 7,000 units level. Extra, how many units have I sold? 2,000 units. Every unit extra gave me a 4 rupees of contribution. So 2,000 into 4, extra contribution, how much I earned? 8,000 rupees. That extra contribution itself adds to my profit. Are you guys able to understand this? Are you guys able to understand? Sir, why are we doing this, sir? Why are we doing this, sir? Simple. The difference in profit is nothing but the contribution generated out of the difference in the units, a difference in the volume. Are you agreeing with me on this? If you know this, the entire concept of volume analysis can be mastered. Suppose in exam, they have not given all this data. They have only given you the top line and the bottom line. Sir, what is this, sir? Example, in your exam, they have just given you the scenario, right? They have just given you volume, right? And they have given you, let us say, for example, they have just given you volume, profit. Now, how much is the volume? 5,000 units volume. What is the profit? 10,000 rupees. Now, next, if your volume is 7,000 units, your profit is going to be 18,000 rupees. In exam, let us say this is all they have given. They have asked you to compute the contribution per unit, the fixed cost. This is all they have asked. Or in other words, they have asked you to prepare income statement for 10,000 units volume level. Sir, nothing has been given in this question. How can we calculate? Simple. What you can do is simple. My profit is how much? 10,000. At how many volume? At what volume level? 5,000 units level. If I increase my volume by 2000 units, my profit increases by how much? 8,000 rupees. Or in other words, the 8,000 rupees, the delta profit, the difference in profit is nothing but the difference in contribution. Or in other words, this 8,000 rupees is nothing but the contribution generated out of this incremental units of 2000 units. Or in other words, can I come to a conclusion and say contribution per unit is equal to difference in profit? It is called as delta profit. Delta means what? Difference divided by difference in units, that is volume. Correct? In this case, how much is the delta profit? The difference in profit is how much? So from 10,000 it has increased to 18,000, which means 8,000 rupees is the extra profit, right? This is the contribution generated on account of increase in volume. How much is the difference in volume? 2000 units. Or in other words, can I say 8,000 rupees is the contribution generated out of 2000 units. How much is the contribution generated per unit? 8,000 divided by 2000. This is rupees. 8,000 divided by 2000. It is going to be how much? Rupees 4 per unit. Are you guys able to understand? Now you got the contribution per unit. Right? With this, you can calculate your fixed cost. Sir, how can we calculate the fixed cost? Simple. We know the marginal costing income statement. Sales minus variable cost is equal to contribution. So we can say, look at this. Contribution minus fixed cost gives me profit. Take any one volume level. Sir, 7,000 units volume level you want to take. Simple. At 7,000 units volume level, what will be the contribution? Just now we computed the contribution per unit. So 7,000 into 4. How much is that? So 7,000 into 4 gives you, so it's going to be 48,000. All right. So you get 48,000. Sorry, 7,000 into 4 gives you 28,000. So sorry guys, 7,000 into 4 gives you 28,000 minus fixed cost gives me, what is the profit at 7,000 units level? 18,000 rupees. Right? So how much the fixed cost? This goes to the other side. I will say fixed cost is equal to 28,000 minus 18,000. It's going to be how much? It's going to be 10,000 rupees. Are you all able to understand? So now with this, we calculated the contribution per unit. We calculated the fixed cost. With this, at any volume level, you can prepare the marginal costing income statement. Suppose they are asking you the question for 10,000 units level, how much is going to be your overall profit? Simple. You just say contribution minus fixed cost gives you profit. What is the contribution? So 4 into 10,000, 40,000 minus fixed cost. Just now we calculated 10,000. You get a profit of how much? 30,000. Clear with this, guys? That's all. So they had just given us the total volume. They had just given us the total profit for two different volume levels, the top line and the bottom line. That is just the top line and the bottom line. If they have given, you can prepare the entire marginal costing income statement for any output level. For this, you need to understand the concept called volume analysis, where here we found out the contribution per unit is equal to delta profit divided by delta units. Sir, why sir this logic? No need to mug up. The delta profit, the difference in profit is nothing but the difference in contribution, and that difference in contribution of 8,000 rupees is nothing but the contribution generated out of the extra units, difference units, that is 2,000 units, which means per unit how much is the contribution. We calculated the contribution per unit. With that, we can do all the other calculations and arrive at the fixed cost. Are you guys able to understand this? Are you guys able to understand? Suppose in this question, right, the sales, instead of volume, they have given it in value. Example, I'm telling you, suppose in this question they had given the sales in value, right? So the sales in value here, 5,000 hints of 5,000 units, they have given 50,000 rupees. The profit is 10,000. If my sales is 70,000 rupees, the profit is going to be 18,000. Suppose this data alone they had given. Now what you need to do, very simple. So instead of contribution per unit, I can calculate the PV ratio here. So can I say PV ratio is equal to delta profit divided by delta sales in value. clear with this, guys? So I can say simple, this 8,000 rupees is the contribution pertaining to the incremental sales. How much was the incremental sales here? So 20,000 rupees of incremental sales. From 50 it became 70,000, right? So 8,000 rupees is the contribution pertaining to a sales of how much? 20,000 rupees, which means in this case, how much is the PV ratio? I can say the PV ratio is simple, 8,000 rupees divided by 20,000 into 100. It's going to be how much? It's going to be 40%. Are you guys understanding this? You can just play around with the figures. You can literally play around with the figures. So here we saw two formulas. One, contribution per unit is equal to delta profit divided by delta volume, sales in units, or PV ratio is equal to same formula, only instead of units you use sales in value, delta profit divided by delta sales in value. Are you guys able to understand this? Are you guys able to understand this? That's about this area. Fine, guys, clear with this? Similar thing you can also do on the cost side. On the cost side, literally the same question they can also give you, right? 5,000 units, 7,000 units are there, right? I will just put it up here. Let us say in the question, this is all they have given, right? So I'll mention it here. Volume and cost. Volume and cost. So what are the two different volumes we have? 5,000 units, 7,000 units, and let us say they are just given cost 40,000 rupees, right? Sir, at 5,000 units level, the total cost is 40,000. At 7,000 units level, the total cost comes out to 52,000. Now, in this case, they are asking us to find out how much is the variable cost, how much is the fixed cost. Will you be in a position to calculate? First, you tell me, is this a fixed cost? No. Why? Had it been a fixed cost, it would have remained constant in total, right? Is this a variable cost? Let us check. Now, variable cost, what is the behavior pattern of variable cost? It remains constant on a per unit level. So 40,000 divided by 5,000, how much you get? It's going to be 8 rupees. Whereas 52,000 divided by 7,000, you get how much? 7.4 something. So literally this is not constant on a per unit level. This is also not constant in total, which means it's a semi-variable cost. It has one component of fixed, one component of variable in it. Now in this case, how will you calculate? How will you arrive at the fixed component, variable component? Very simple, using this formula. Variable cost is equal to difference in total cost divided by difference in the total units. Right? Sir, how will we do that, sir? Simple. If I was selling 5,000 units, what was my total cost? 40,000 rupees. Now, if I increase my volume by 2,000 units, my overall cost increases by how much? 12,000 rupees. Now, why does my cost increase by 12,000 rupees? This cost comprises of variable plus fixed. Now, the increase in cost is purely on account of the variable component, because fixed component will not increase my total cost. Right? Now can I say this 12,000 rupees is nothing but the variable cost pertaining to this extra 2,000 units, right? Or in other words, how much is the variable cost per unit? 12,000 divided by 2,000. This is the variable cost for the extra units of 2,000, which means on a per unit level, how much is it? Delta cost by delta units. Here I will say it is nothing but how much the delta cost here? So the difference in cost is going to be 12,000 rupees. The difference is in units is going to be 2,000 units. It's going to be 12,000 divided by 2,000 units. You get how much? It's going to be rupees 6 per unit. Right? Now with this, you can calculate the fixed cost. So now how much will your fixed cost be? Simple, take any one volume level. From there, the total cost minus the variable component is going to be your fixed component. So the total cost minus variable cost gives you fixed cost. Now take any one volume level. 5,000 units volume level will take, what is the total cost? 40,000. From that, subtract your variable component. How much is the variable component? 5,000 units into 6. So 5,000 into 6 is 30,000. So 40,000 minus 30,000 gives you how much? A fixed cost of 10,000 rupees. Are you guys able to understand? So literally, guys, the variable cost is nothing but variable cost per unit is equal to delta cost, difference in total cost, divided by difference in total units. Are you guys clear with this? Are you guys clear with this? Suppose the same thing goes here. The volume, if it is not expressed in units, if they have expressed this in sales, right? If they had mentioned this in sales value, let us say this is going to be rupees 50,000. and this is going to be rupees 70,000. Let us say they had mentioned, when my sales is 50,000 rupees, my total cost is 40,000. When my sales is 70,000 rupees, my total cost is how much? 52,000. In this case, what I will say, sir, this extra 12,000 rupees of variable cost is something that I incur because my sales has increased by 20,000 rupees. Or in other words, this 12,000 rupees is the variable cost attributable to the sales of how much? 20,000 rupees. Or in other words, 12,000 by 20,000. Here you get variable cost ratio. Are you guys able to understand? So here I can say VC ratio is equal to delta cost divided by delta sales in value. Are you all able to understand? This study is called as volume analysis. What we are doing for a change in volume, we are analyzing for the change in volume, the impact it has on your profitability or your cost side. Are you guys clear with this? Literally guys, how did I arrive at this figure? 5,000 units, total cost is 40,000. How did I arrive? Simple. I took the total variable cost plus fixed cost, I added it up and I put it here. Similarly, 7,000 units, what is the total cost? 42,000 plus 10,000, it becomes how much? 52,000. Suppose in exam only this data is given, will you still be able to calculate and do all the workings? Yes, that is what I have just taught you right now. So if you just have the top line and the bottom line, you will be in a position to crack this entire area. So these are all the formulas which we saw here. PV ratio is equal to delta profit by delta sales, or contribution per unit is equal to delta profit by delta units. On the cost side, variable cost ratio is equal to delta cost, difference in total cost by difference in sales value, or variable cost per unit is equal to delta cost divided by delta units. The formula is mentioned here. The logic for that, literally we learned with the help of this particular example. Any sum that comes in this area, you will be able to handle it. Clear with this guys? And that is all about this particular concept of volume analysis. Simple, neat, and that's about it guys. Beyond this, you need not take the pain of mugging up anything, right? This is once again a common concept in your CA intermediate as well as in your CMA intermediate, both in paper 8 and paper 12, right? So with that, we have finished this particular concept of volume analysis, right? So this particular concept is also now over. Now let's go ahead to the next concept called as sensitivity analysis, right? So first we will complete the sensitivity analysis and then we will come back to sales mix. Now guys, this sensitivity analysis, what does this talk about? What does this segment of discussion deal with? Now guys, if you notice in this chapter as of now, we talked about 4 different types of input. That is, there are 4 different factors which can affect our profit. What are these 4 factors? Simple. Selling price, variable cost per unit, right? Then fixed cost, obviously in total, and finally your volume, right? There are 4 different factors which can affect your overall profit, right? Now, which can affect your overall profit. Now, we have studied how these 4 factors impact my profit through certain tools like PV ratio, right? Your break-even point, your margin of safety. Literally, guys, this is a summary of what we have learned till now. Literally, marginal costing is all about studying how these 4 different inputs can impact your profit through these 3 tools called as PV ratio, break-even point, and margin of safety. Now, in this concept, sensitivity analysis, what we are going to revise is that now, keeping the out of these 4 variables or the inputs, let us say I am keeping these 3 inputs constant, I don't change it. Suppose if I increase or decrease my selling price alone, keeping my variable cost per unit, fixed cost and volume unchanged, how is it going to impact my profit is the study called as sensitivity analysis, or in other words, the study of change in impact or the study of change in one variable while keeping the other variables constant, and how it impacts my profit is called as sensitivity analysis. Literally, guys, this is what I would have mentioned even in our concept decoder. Sensitivity analysis is a study of rate of change in one variable with respect to change in another variable, keeping the other variables constant. Sir, what is this? Quickly, I will just give you guys a practical flow chart and a practical case scenario. It's not a case scenario basically. So I will open up and I will show you a practical flow chart. With this, you will have a crystal clear clarity. Now, sensitive. What do you mean by sensitive? We say, my friend is very sensitive. Means what? While other things being constant, suppose if one thing alone happens, how he or she reacts to that is called as sensitivity. Right here, let us say I don't change my variable cost per unit, I don't change my fixed cost, I don't change my volume. Suppose selling price alone, if I increase, how is it going to impact my profit? Will it increase or decrease my profit? We will study the impact of increase in selling price through the impact it has on PV ratio, break-even point, margin of safety. Suppose I keep the other three things constant, variable cost alone I increase, how it impacts my profit? This is a study of sensitivity analysis. Now, no problem. Let me just open this chart and show it to you. Now, we will do it together, and this way, entire thing, we will be completely finishing it off. Now, guys, now, what are the three tools that we study in this particular chapter? Basically, I told you, PV ratio, break-even point, and margin of safety, right? Perfect. Now, yes, now look at this. Let us say I am keeping everything constant. Selling price alone, what I do, I am increasing. For example, let us take the same example which we saw. Selling price at present is 10. Variable cost is 6, which means contribution per unit is going to be 4, right? Let us say my fixed cost is going to be 10,000 rupees. 10,000 rupees. Yes. In this case, what is going to be my break-even point? My current break-even point is going to be how much? 10,000 divided by 4. It is going to be 2,500 units, right? At present, my volume, let us say, is 6,000 units, which means at present my margin of safety is how much? 6,000 minus 2,500, which is going to be 3,500 units. This is my current data which I am presenting it to you. Now, let us say I don't change my variable cost per unit, which means my contribution is also remaining. My contribution will not change because of variable cost. Fixed cost I'm not changing. Let us say the total volume I'm not changing. Selling price alone, let us say I am increasing. Now, what happens to my PV ratio? At present, what is the PV ratio? 4 by 10 into 100. 40% is my current PV ratio. Example, suppose if I change my selling price, if I increase my selling price to 12 rupees, variable cost continues to be 6, which means my contribution per unit becomes how much? 6 rupees. Right? So now what is the PV ratio? 6 divided by 12 into 100. Obviously PV ratio becomes 50%. Or in other words, if I do not change the other three variables, an increase in selling price will actually increase my PV ratio. Correct? It will increase my PV ratio. Now, what impact will it have on my break-even point? Simple. Now, every time I'm selling one unit, right, obviously I am able to generate more contribution. In this case, now I will be able to recover my entire fixed cost quickly. Guys, clear with this? Which means my break-even point will reduce. Are you guys clear with this? Right? So in this case, my break-even point will reduce. Why? Because I've increased the selling price. Every time I sell one unit, I will be able to generate more contribution. which means that in this case, now I will be able to recover the same fixed cost. Now, how much is the fixed cost? 10,000 rupees. Every time I sell one unit, I will generate 6 rupees. So literally, if you see 10,000 divided by 6, you get your break-even point is 1,666.66 units or 1,667 units. Earlier, it was taking me 2,500 units to actually recover 10,000 rupees. Now it only takes me 1,667 units to recover the same 10,000 rupees. Or in other words, every time I sell one unit, I recover more contribution, which means it takes lesser time for me to actually recover the entire fixed cost. My break-even point is less, it drops. Clear with this, guys? Now, what happens to margin of safety? Simple. My total volume remains unaffected, 6,000 units, but my break-even point is now reduced, which means the balancing figure, the number of units sold over and above my break-even point, it's obviously the balancing figure. So this will increase. Are you guys clear with this? So my margin of safety increases, and when my margin of safety increases, margin of safety is nothing but profit generating sales. Obviously, my profit increases. Are you guys clear with this? So the impact of change in one variable, right? So what impact it has on my profit, we are studying through these three tools called as PV ratio, break-even point, and margin of safety. This study is called as sensitivity analysis. Are you guys clear with this? That's all it is, guys. So an increase in selling price, what will happen? So it increases my PV ratio. So now, because my contribution per unit will increase, now what happens? Since every unit gives me more contribution, I'll be able to recover the entire fixed cost quickly. So my break-even point will fall. Now, volume remains unchanged, break-even point reduces, the balancing figure, which is basically my margin of safety, will now increase. And when my margin of safety increases, profit will automatically increase, because after all, margin of safety is nothing but your profit generating sales. Are you guys clear with this? Similarly, suppose there is a reduction in your selling price. In this case, what happens? Think and answer. Now, my selling price reduces. Let us say here, instead of 10 rupees, my selling price becomes 8. Variable cost continues to be 6, which means contribution per unit is 2 rupees, right? So now obviously my PV ratio falls 2 by 8 into 100, which is 25% only. Obviously, guys, my PV ratio will fall. Now, what happens to my break-even point? Every time I sell a unit, now I'm generating lesser contribution. It means I will take more time to now break even. So break-even point increases. Now, what happens to margin of safety? Total number of units sold, volume is same, but break-even point has increased, which means now the balancing figure, margin of safety, will fall. And when my margin of safety falls, what happens to your profit? The profit also drops. Are you guys clear with this? That's all it is. That's all it is. Next, now let's go to the second variable. What is the second variable? The second variable is your variable cost. The second input factor is variable cost. Suppose other things remaining constant, I am increasing my variable cost. Visualize. Now, selling price is same, variable cost I am increasing. If I increase my variable cost, what happens to my contribution per unit? My contribution per unit will fall. So when my contribution falls, obviously my PV ratio will fall. Clear with this, guys? Now, every time I sell a unit, I am generating lesser contribution, which means now it takes more time for me to recover the entire fixed cost. So break-even point will increase. Are you guys clear with this? Now, volume is same. Break-even point is more, which means the balancing figure, margin of safety, will fall. If my margin of safety falls, my profit will also fall. Are you guys able to understand an impact which a change in one variable has on my profit is studied through these three tools called as PV ratio, break-even point, margin of safety. This study or analysis is called as sensitivity analysis. Now you guys are getting it? Right. Now, the other one, next one. Suppose other things remaining constant, variable cost reduces. Now, per unit variable cost reduces. In this case, what happens? Selling price remains the same. Variable cost reduces, which means my contribution will increase. When my contribution increases, PV ratio will increase. Right now, every time I sell a unit, I'm able to generate more contribution, which means now I will be able to recover my entire fixed cost quickly. So my break-even point falls. Volume is the same, but my break-even point is less, which means my margin of safety balancing figure will now start to increase. So margin of safety is more. When my margin of safety is more, my profit will also increase. That's all, guys. That's all. It is very, very, very simple. Next one. Next one. Now, what is the third variable we've got? Fixed cost. Now, carefully think. Suppose other things remaining constant. Sir, selling price per unit I'm not changing. Variable cost per unit, I'm not changing. Fixed cost alone, let us say I am increasing. First, you tell me what will be the impact on PV ratio. What is PV ratio? Contribution per unit divided by selling price. Now, fixed cost I am increasing. Because of this, will my PV ratio change? Absolutely not. So, with respect to my PV ratio, there will be no change at all. Now, what happens to my break-even point? Sir, every time I'm selling 1 unit, contribution per unit remains to be the same. But suddenly, fixed cost alone is more. Now, break-even point is fixed cost divided by contribution per unit. Now, in my break-even point, now what happens? The numerator, fixed cost has increased, which means I need to recover more amount right now. Obviously, because of this, what happens? So now I take more time to recover because right now the fixed cost has increased. Are you guys clear with this? So my break-even point increases. Now what happens? The total volume remains to be the same, but break-even point has now increased, which means the balancing figure, margin of safety, now reduces. Are you guys clear with this? This is all it is. Now, exactly the opposite of this. Suppose my fixed cost falls down. What will happen in this case? If my fixed cost falls down, now what happens to PV ratio? No change, because PV ratio is nothing but contribution divided by sales, right? Contribution per unit divided by selling price. This will not, fixed cost will not impact my PV ratio. But what happens to my break-even point? Now I need to recover only lesser amount as fixed cost, which means now the break-even point will fall, because now by selling lesser number of units, the entire fixed cost can be recovered. Volume is same, your break-even point is reduced, which means now the balancing figure, margin of safety, will increase. When my margin of safety increases, my profit will automatically increase. Are you guys clear with this? The last one, which is your volume. The last one, which is your volume. Now, other things remaining constant. So, selling price per unit, I'm not changing. Variable cost per unit, I'm not changing. Fixed cost in total, I'm not changing. Volume alone, I am increasing. Now, think and answer. What will happen to PV ratio? Absolutely no change. Why? Because obviously PV ratio is what? Contribution per unit divided by selling price. Now, on a per unit level, the contribution is not changing, right? My selling price is not changing. Even variable cost is not changing. Obviously, here the PV ratio will remain unchanged. Guys, correct? Now, what happens to my break-even point? Break-even point is fixed cost divided by contribution per unit. Now, fixed cost is not changing. Contribution per unit is also not changing, which means even my break-even point will not undergo a change. But now, what happens to my margin of safety? Now, volume alone has increased right now. Let us say now, instead of 6,000 units, I am selling 8,000 units. Now, what happens? Now, what happens, guys? Break-even point remains to be the same 2,500 units, but volume alone has increased, which means the balancing figure, margin of safety alone, increases. Are you guys clear with this? In this case, your increase in volume will only impact what? Your margin of safety, and because of this, automatically you will be able to generate more profits. Are you guys clear with this? This is all it is. Suppose my volume drops. What will be the impact on PV ratio? Absolutely nothing, right? Break-even point, nothing. Why? Break-even point is fixed cost by contribution per unit. Numerator, denominator remains unchanged. What happens to my margin of safety? Now, break-even point is the same, but the total number of units sold is less. Because of this, the balancing figure, margin of safety, falls. Clear with this, guys? This is why generally they say if you sell more number of units, overall profit will increase. Why? Purely because break-even point is a point. Anything excess sold in excess of the break-even point is going to be margin of safety. So if the volume increases, margin of safety will increase. The volume decreases, margin of safety will reduce. Because of that, the profit will increase or decrease as the case may be. This will not impact your break-even point and other things. Are you guys clear with this? This study is called as sensitivity analysis. If you put this arrow and study, this entire area you'll be able to master. And that's about this area, guys. Clear with this, guys? So literally what we have seen, your profit can be impacted by only these 4 variables, and what we have seen is a change in any one of these 4 variables will impact your profit, and we studied the impact of the change in any one of these 4 variables or inputs through PV ratio, break-even point, and margin of safety, and this entire study is popularly called as sensitivity analysis. As simple as that. Clear with this, guys? Now we will just go and solve one numerical problem. Once again, we'll be doing this from our CA Inter solved question bank. It's in volume number 2. So please go to question number 15A. Please go to question number 15A. I just want to take this. Yes. Right. Now look at this. This was, I think, I'm not sure if this was a past exam MTP question or an RTP question, but somewhere it was once asked. By noting PV ratio will increase or PV ratio will decrease or PV ratio will not change, as the case may be, state how the following independent situations will affect my PV ratio. They are asking independent. They have asked about 10 scenarios, right? In each of the scenario, just they have asked for the impact on the PV ratio, nothing more. Conceptually you learn. Please do not mug up anything. Try to attempt it, and that's about this particular question. First, how will your PV ratio be affected? Will it increase or will it decrease, or will there be no change? Right, this is what they have asked, right, in each of the following situation. Number one, an increase in the physical sales volume. Now if I increase my physical sales volume, how will it impact my PV ratio? Now we all know PV ratio is nothing but contribution divided by, or contribution per unit divided by selling price, right? Now if there is a change either in the numerator or the denominator, only then PV ratio will change. Now first, an increase in the volume. Now tell me, will it impact my PV ratio? Absolutely not. We just saw an increase or decrease in the volume will only impact my margin of safety. Nothing else will be impacted, guys, correct? So in this case, what happens? An increase in the physical sales, it will not impact my, there will be no change. It will not impact what? It will not impact my PV ratio. Look at this. My PV ratio will not change. The ratio of sales value and the variable cost will remain the same irrespective of the change in the sales volume. Obviously, what happens? My numerator denominator does not change. Now, how will my PV ratio change? The next one. If there is an increase in fixed cost, will this change? Will this impact my PV ratio? Absolutely not. This will only impact your break-even point. When your break-even point gets affected, the balancing figure, margin of safety, will also get affected. Definitely this will not impact your PV ratio. No change. Clear with this? Why? Because obviously here in the numerator or the denominator remains unaffected, right? Contribution per unit is not changing. Selling price per unit is also not changing, right? So obviously in this case, what happens is that your PV ratio will not change. Clear with this, guys? There will be no change. Next one, a decrease in the variable cost per unit. Now if my variable cost reduces, what will happen? My contribution per unit will increase, guys. Clear? So because of that, obviously my PV ratio will now start to increase. Clear with this? Now look at this. PV ratio will increase. Are you guys clear with this? This is what we have studied in a chart format. Now they're asking this. Easily you will be in a position to answer. The next one, a decrease in contribution margin. Now obviously if my numerator reduces, contribution per unit reduces, what happens in this case? Obviously my PV ratio will also fall. Look at this. PV ratio will decrease. Next situation, an increase in the selling price per unit. Now if my selling price per unit has increased, what will happen? Because of this, contribution per unit will increase. If my contribution per unit increases, obviously my PV ratio will also increase. Now look at the fifth one. PV ratio will increase. Then a decrease in the fixed cost. Fixed cost will not impact my numerator or my denominator. Hence my PV ratio will not change. No change here. Question number 6, no change. Next, a 10% increase in both the selling price and the variable cost per unit. Now in this case, now they are not changing one variable, they are changing two variable. How can you answer? You should take a scenario and do it. For example, selling price, variable cost, and then your contribution per unit. At present, let us say 10 minus 6 is equal to 4. What have they said? A 10% increase in both the selling price and the variable cost. 10% in selling price will be what? So 10 plus 1, it is going to be 11. Variable cost, 10% increase. What is this? 6 plus 10% of 6 is 0.6. So it's going to be 6.6. What will happen to the contribution per unit? So 11 minus 6.6 gives you 4.4. So what is the PV ratio at present? 4 by 10 into 100. It's 40%. Here it's 4.4 divided by 11 into 100. Once again, it's going to be 40%. Now, here what happens? There is no change when there is exactly a 10% increase in both the selling price as well as the variable cost per unit. You can take any one factor, any one figure right here, model data, you can take on that, you can increment and apply the change and check it out. So here there will not be any change. Clear with this, guys, right? This is what you can just go ahead and update. Next one, a 10% increase in the selling price per unit and a 10% decrease in the physical sales volume. First one, understand here also two inputs are changing. One is an increase in selling price, the other one is increase in the volume. Now, first of all, understand, there is a decrease in the volume. Any change in the volume will not affect my PV ratio. So the only impact here is on the selling price per unit. Clear with this, guys? Now, a 10% increase in selling price. What will happen here? Now, if my selling price increases by 10%, obviously my contribution will also increase, and because of that, my PV ratio will only increase. This will not have an impact on PV ratio. This will have an impact on profit. Here in this question, they have only asked for the impact on PV ratio. So my PV ratio will increase. That too, it's purely only on account of what? An increase in your selling price. So point number 8, look at this. PV ratio will increase. Clear with this, guys? The increase in selling price will increase the contribution margin, but the change in volume in any direction will not affect the PV ratio. You should write the reasoning in exam. How will you write it? Just visualize whatever chart which we did, and this is more than sufficient for you to crack these kind of questions, right? Thus, an increase in selling price will decrease your sales volume. With the decrease in sales volume will only increase your PV ratio. Anyways, decrease in sales volume will never affect your PV ratio. So the increase in PV ratio is purely on account of increase in your selling price. The next one, a 50% increase in a variable cost per unit with a 50% decrease in the fixed cost. First of all, understand, a change in fixed cost will not impact your PV ratio. It will impact your overall profitability by way of break-even point and all that. But here in this question, they have only asked for the impact on PV ratio. PV ratio will get impacted in this case only on account of change in the variable cost. Variable cost is increasing. So if my variable cost increases, selling price remains constant, contribution per unit will decrease. When my contribution per unit decreases, what happens? My PV ratio will also fall. So point number 9 here, PV ratio will decrease. Are you guys clear with this? Logically think and answer. That's all it is. An increase in the angle of incidence. Oh, what do you mean by angle of incidence? I will tell you. Very simple. This is actually presented in a graphical format. I will tell you here. One second. Now, look at this. This is basically your break-even chart, right? Where here on the y-axis you have rupees, and on the x-axis you have the number of units. Now, simple. As you increase the number of units, this is your variable cost line. What is this variable cost line? Now, if I produce 0 units, variable cost is also 0. That's why it starts from here. If I slowly increase the number of units, parallelly, my variable cost will also increase. Clear with this, guys, right? Now, ideally speaking, here you have a fixed cost line. All these things you would have studied in your foundation or even in your school days economics. Fixed cost line is flat. It will not change with the number of units, right? Let us say fixed cost is 2 lakh rupees, 200,000. Now, if I produce 0 units, still I will be incurring fixed cost alone. That's why your total cost basically is nothing but fixed cost plus variable cost. This line starts from here and it slowly increases, right? Here, this is your fixed cost line. Any increase in volume will not impact your fixed cost. So your total cost alone, what happens? Increases, because parallelly your variable cost line is your, and parallel to this variable cost line, you'll be having the total cost line, because total cost is fixed cost plus variable cost. That's why it is running parallel here. Now, what we need to do here, this is your total cost line, basically your fixed cost plus variable cost. This is your sales line, right? Sales line, basically it starts from 0. So if I don't sell any units, my revenue is 0. If I keep on increasing my units, obviously my turnover will also increase. Now, what happens, guys? This is going to be my sales line. This is going to be my cost line, total cost. Now, break-even point is a point where my total sales is equal to total cost. Only in that case, exactly I will be earning a profit of 0, right? So this is my break-even point, right? Now, if you notice, this is going to be my sales line, right? Now, if you notice, below the break-even point, my cost is always greater than sales. This is the reason why you are reporting a loss. At the break-even point, my total cost is equal to total sales. Hence, there is a 0 profit or 0 loss. And above this break-even point, my sales, right, is greater than my total cost. Hence, above the break-even point, you are always making a profit. This is a graphical presentation. Now, from the break-even point to above, there is an angle that has been generated here, right? This angle is called as angle of incidence. Simple, guys. Now, if the angle is wider, obviously it means the difference between my sales and cost is more, or in other words, my profit is more. So, if this angle is more wider, let us say if the angle is like this, then what happens? The difference between my total sales and total cost will be more, and it indicates a more profitability. Or in other words, if there is an increase in the angle of incidence, my profit will increase. Are you guys clear with this? If there is a reduction in the angle of incidence, in that case my profit will reduce. So this is something that you need to understand in a graphical presentation. So now in this question, if you notice, they have asked what will happen, what will be the impact on PV ratio if there is an increase in the angle of incidence. An increase in the angle of incidence indicates that the company is earning at a higher rate, or in other words, there will be an increase in your PV ratio. This is all you need to know. Are you guys clear with this? This is once again logical, provided you know this particular graphical format, and as simple as that. So here we've seen, so my PV ratio will only increase if there is an increase in my angle of incidence. Angle of incidence represents the rate of profit earning after reaching the break-even point. Just now I taught you, right? And increase in the angle of incidence means the rate, there is an increase in the rate of profit earning, which is nothing but the PV ratio that contributes towards the profitability after recovering your fixed cost. Are you guys clear with this? So this is all about it. 10 different scenarios, right? We have just learned it. I mean, we have just revised all these things with a conceptual revision of sensitivity analysis. Now, for this particular question, I request you to please go and update your library of adjustments. So please go ahead and update, write down sensitivity analysis, hyphen impact on PV ratio in 10 different situations. In 10 different situations. An excellent question to summarize and revise the entire concept of sensitivity analysis. So this is once again logical. Now please do not mug up. If you are a person who's been mugging this up, I've just proved it to you how simple and effective you can revise this entire area. Just we have studied conceptually. In fact, in the marathon itself, I have done one numerical problem, right? That's about it, right? In our batches, in our regular or EVO batches, we'll be doing a few more numerical problems. But here, since this is a marathon and I didn't want to miss this question also, so one full-fledged question we are solving, right? So with that, we have completed this particular concept of sensitivity analysis. So this particular concept of sensitivity analysis is now over. Now let's move Sorry, there was an issue with the mic. So I'll just repeat this area again. So now we are going to get started with the next concept called as sales mix in marginal costing. Now, till now, in sensitivity analysis, we have learned that these four variables or inputs, namely your selling price, variable cost, fixed cost, and volume, these four variables or inputs will only impact your profit. A change in any one of these four inputs is only going to impact your profit. But now, in this next segment of discussion, which is sales mix, we will learn that ideally there is one more fifth input factor called as your sales mix, which will also impact your profitability. Now, let me take the heading here. Sales mix and marginal costing. Now guys, let me take an example of BMW. Now, as you guys know, BMW is in the business of manufacturing car as well as bikes, right? Now, let me take an example here. Now, I am taking 2 years, let us say in the year 2025 and in the year 2026, right? Now, between these 2 years, BMW did not change the selling price of bike and car. They did not change the variable cost per unit of their products, bikes and cars. They also did not change the fixed cost. It was also constant. And for your information, the volume was also constant. That is, in the year 2025, they sold a total of 1 lakh units. This 1 lakh comprises of, let us say, 60,000 cars and 40,000 bikes. Now, in year 2026 also, they sold 1 lakh units. So here, the volume did not change, but the composition, that is the sales mix alone changed. Here, if you notice, they sold 40,000 cars and 60,000 bikes. So guys, if you notice here, selling price did not change, variable cost did not change, fixed cost did not change, even the total volume did not change, but the composition of the total volume, basically the sales mix alone changed. Now you tell me, the profit reported in 2025 and the profit reported in 2026 will definitely be different. Why? Sir, the four inputs we saw did not change, sir. Still, why was there a change in the overall profit? This was purely because of the change in the sales mix. Or in other words, sales mix represents the composition of the different products that the company is dealing in. Till now, whatever we have learned is all about a concept of all this marginal costing in case the company deals only in one product. But in real life, companies deal in more than one products. Now, in case when company deals in more than one product, in that case, there is a fifth factor which affects your profitability, which is called as sales mix, right? This is something that is very, very important. Now, guys, in this particular scenario, how do we apply the concepts of marginal costing is the study in this scenario called as sales mix. Now, the most important factor here is regarding calculation of break-even point. Now, guys, we all know break-even point formula. What is the formula to calculate break-even point? It is going to be fixed cost divided by contribution per unit, right? Now, there is a common fixed cost, right, that needs to be recovered by way of generating contribution, right? So fixed cost divided by contribution per unit. Now, let us say the company deals in two products, A and B. Now, in the denominator, should I take the contribution of product A or should I take the contribution of product B or should I jointly take the contribution of A as well as B is the study in this particular scenario. Or simply in other words, now there is a common fixed cost which is incurred, right, towards production on sales of two products. In our example, two products. A company can also have three products or any number of products. Now, this fixed cost has to be jointly recovered by both the products put together. In this case, how will you compute the break-even point? And all these things are the subject matter of discussion in this particular scenario. Now, without any further delay, now let's go and take up one numerical problem with the example of, with the help of this particular numerical problem. We will clearly be able to understand the concept of sales mix, and it's a good sum to revisit or revise this entire concept of sales mix, right? So now please go to your solved question bank, CA intermediate solved question bank, and please take question number 19. Question number 19. See, our question bank is comprehensive. Every single question from our study material, right, past exam, RTPs, MTPs, everything has been covered. Beyond this, you don't need any other thing, right, in your exam preparation. Beyond this, there is nothing more you need, because everything I've compiled it in a single place, right? That two similar questions I've grouped and all. You can see the color pattern. For example, it is 18C. So 18 is the main question. A, B, C and all are questions which are similar to question number 18, something like that. So right, so here you have MTP2, every single thing has been included here. So now please take question number 19. This is about your sales mix. Now the following set of information is presented to you by your client AB Limited producing the two products X and Y. Now what have they mentioned? Product X, product Y, right? Direct material, direct wages, the cost is given for each of the two products. The fixed expenses during the period was 1,600 rupees, right? The variable expenses are allocated to the product at the rate of 100% of direct wages, and the selling price is given as 40 rupees and 30 rupees each, right? Now there are two products X and Y. What is the selling price? 40 rupees and 30 rupees, right? Now what is going to be my total variable cost? Now for product X, literally if you see, we have 20 rupees direct material, 6 rupees wages, and 100% of direct wages is variable overheads. So another 6 rupees we have here. So literally 20 plus 6 comes out to how much? 32 rupees, right? So it's going to be 32 rupees is the total variable cost of product X. Similarly for product Y, 18 material, 4 rupees is your direct wages, and 100% of direct wages, that is another 4 rupees is your variable overheads. If you add this up, how much you get? 18 plus 4 plus 4. So you basically get 26 rupees, right? This is going to be your total variable cost of product Y. So literally the contribution per unit of X is going to be 40 minus 32, 8, and contribution per unit of Y is going to be 30 minus 26, which is going to be 4 rupees. Right, guys? Now, in this scenario, they have asked the proposed sales mix scenario number 1. Let us say they are selling 100 units of X, 200 units of Y. What will be the profit? Scenario 2, 150 units of X, 150 units of Y. What will be the profit? Scenario 3, 200 units of X, 100 units of Y. What will be the profit? You need to compute. The total fixed cost is 1,600. Now, you tell me 100 plus 200, overall volume is 300 units. 150 plus 150, overall volume is 300 units. 200 plus 100, overall volume is 300 units. Here in these three scenarios, volume is not changing, but the composition, mix alone we are changing. Clearly because of that, what happens? Your profitability will change. Why? Because X is a more profitable product. 8 rupees contribution you get for every unit of X. Y, you get only 4 rupees. So obviously in that mix, if you are selling more of units X, obviously the overall profit will be high. Are you clear with this? Right? This is how it works here. Right? So in each of these scenario, you need to compute the profit. Nothing great. Number of units multiplied by the respective contribution per unit, you'll get the total contribution. From that, subtract your overall fixed cost, you will arrive at your profit. This is not the great thing. The most important thing is with respect to calculation of break-even point. Now this also, the first part I will quickly do, and with that this will be over. Now look at this, the contribution per unit we have done. Suppose I am selling 100 units of X, 200 units of Y. What will be the total contribution here? 100 into 8, I get 800. plus 200 into 4. How much is 200 into 4? That is once again another 800. So literally the total contribution will be 1600 minus your fixed cost, that is also 1600 rupees. So literally you will be left with a zero profit. Clear with this, guys, right? So that is the first situation here. Look at this, 100 into 8 plus 200 into 4, that gives you 1600 rupees contribution minus fixed cost 1600, you get a zero profit. Suppose I'm selling 150 units of X, 150 units of Y. Simple, 150 into 8 plus 150 into 4. So 150 into 8 gives you how much? It gives you 1200 rupees, and 150 into 4 gives you 600 rupees. So overall, you get a contribution of, so 1200 plus 600 is going to be 1800. Minus your fixed cost of 1600, it gives you a profit of 200. See, the overall volume didn't change, but just because of the change in the mix, what happens? Your profit is changing. Clear with this, guys? This is not the big deal here. Now, the most important part is calculate the break-even point when the sales mix is 2:1. Now, in this case, now how will we actually calculate the break-even point? This is the most important part of calculation in this entire concept of sales mix. Quickly we will revise. So now what is going to be my sales mix? It is going to be 2:1. Now each of the two products we have got here, now let me put it here. We have two products here. What are the two products? Product X and product Y. Now how much is the contribution per unit of X? 8. Y is going to be 4. 8 and 4. This is going to be my contribution per unit. And what have they given? The sales mix is going to be how much? It's going to be 2:1. So the sales mix is going to be 2:1. Which means what? Sir, every time you are selling 3 units, 2 units come from product X and 1 unit comes from product Y. So for every 3 units sold, 2 units are X and 1 unit is product Y. Clear with this, guys? Now in this case we need to compute the break-even point. Now what is the formula for break-even point? Fixed cost divided by contribution per unit. Now in this case, will I take the contribution per unit of X or will I take the contribution per unit of Y? Ideally speaking, we should take the contribution per unit of both X and Y. Sir, how will we do that? Very simple. Now you guys tell me 2:1 is the sales mix, which means for every 3 units sold, right? Now can you tell me what is the total contribution? Simple, sir. If I sell 3 units, right, 2 units will come from product X, 1 unit will come from product Y. So 8 into 2 plus 4 into 1. Are you clear with this? 8 into 2 units plus 4 into 1 unit. This will be the total contribution generated for 3 units. So on an average, the weighted average contribution per unit will be how much? Divided by 3. So this is the total contribution for 3 units. If you divide it by 3, on an average, what is the contribution per unit? You can calculate. Guys, clear with this? So how much does it come out to? So 8 into 2 is 16 plus 4 into 1 is 4 divided by 3. So 16 plus 4 is 20. So 20 by 3 comes out to how much? 6.6666. It keeps on going. Or in other words, you can also say, sir, this is nothing but weighted contribution per unit. Actually, we call it as weighted contribution per unit because in this case, this fixed cost is going to be recovered jointly by these two products. Hence, I will have to consider the contribution per unit of both the products. Hence, we don't take the contribution of X or we don't take the contribution of Y. We take the weighted contribution of X and Y. Or in other words, we can also say the weighted contribution can be calculated as follows. So what is product X's contribution per unit? 8. I can say 8 into 2 by 3, that is a sales mix, plus 4 into 1 by 3. This way also you can calculate. The same thing can be rewritten as 8 into 2 by 3 plus 4 into 1 by 3. Are you guys clear with this? This way also you can calculate and show it off, not a problem. Ideally, this is nothing but weighted average, weighted contribution per unit. Now, in case when a company manufactures more than one products, ideally speaking, the formula for calculating the break-even point is nothing but fixed cost divided by weighted contribution per unit. Are you guys clear with this? So in this case, how much is the weighted contribution per unit? 6.6666. So now in this case, you tell me what is going to be your break-even point? My break-even point is equal to, how much is my fixed cost? My fixed cost is going to be 1600. We saw that. So rupees 1600 divided by, what is the weighted contribution per unit? 6.6666. So retain the decimals in your calculator. So it's going to be 1600 divided by 6.6666. You get 240 units. So if I have a total volume of 240 units, I will be able to recover my entire fixed cost of 1600 rupees. I'll be left with no profit or no loss. Now you tell me, is this 240 units of X or units of Y? It is jointly units of X plus units of Y. Now what we need to do, this 240 units, split it into two. So how many units of X, how many units of Y? We know the sales mix. Generally when the company is selling, they will always have the sales mix as 2:1. So which means, so 240 into 2 by 3 will be the number of units of X. 240 into 1 by 3 will be the number of units of Y. So 240 into 2 by 3, how much is that? It's going to be 160 units. 240 into 1 by 3, it's going to be 80 units. Or in other words, if I sell 160 units of X and 80 units of Y, I will be able to break even. That is going to be, I will be able to recover my entire fixed cost of 1600 and I'll be left with no profit or no loss. Are you guys clear with this? This is the way to compute your break-even point when you have sales mix, when you have more than one product for the company and the sales mix ratio is given. Are you guys clear with this? So when a company is having more than one product, in this case, how do we compute your break-even point? Break-even point is equal to fixed cost divided by weighted contribution per unit. How do you compute weighted contribution per unit? The respective contribution per unit multiplied by weight of that particular product. Are you clear with this? As simple as that. Or you can also say the total contribution divided by the total number of units in that particular mix. Are you guys clear with this? It's absolutely logical. Nothing needs to be mugged up here. And this is exactly what I've solved and showed here in this particular solution. Look at this. All these solutions I have improvised, right? So this is not as it is in the study material. It's not a copy paste. This entire question bank, we have revamped it, and literally the presentation also, just like how I've done here, I've presented it. So basically it's going to be 240 units. Ideally this is wrong. It has to be 240 units. Right? So 240 units. So 2/3 and 1/3. Ideally, when the company sells 160 units of X and 80 units of Y, it earns zero profit. That's going to be your break-even point. Are you guys clear with this? Right? This is the most important learning objective here. Suppose if there is a change in your sales mix, accordingly, what happens? Recalculate the break-even point when the sales mix is 1:2. Very simple. Now suppose it is going to be 1:2. Right? So what happens here? Instead of 2:1, it's going to be 1:2. Then what do? Recalculated the weighted contribution per unit. So weighted contribution per unit is equal to 8 into 1 by 3 plus 4 into 2 by 3. Correct? Because 1:2 right now. Right? So 8 into 1 by 3 plus 4 into 2 by 3. Now once again, you need to compute. Quickly, let me do this here. Product X, product Y. What is the contribution per unit? Just now read it here, 8 and 4. So rupees 8, rupees 4. The sales mix is going to be 1:2, which means the weighted contribution per unit is going to be 8 into 1 by 3 plus 4 into 2 by 3. Alright, so how much is this going to be? 8 by 3 plus 4 into 2 is 8. So 8 by 3. Right? Or in other words, it's going to be 16 by 3. So 16 by 3 is going to be what? 5.3333. So here the break-even point is going to be fixed cost 1600 divided by weighted contribution per unit 5.3333. Right? So now here, how much is that going to be? 1600 divided by 5.3333. You get an overall 300 units. So if I sell 300 units overall, I will be able to break even. Now, what is the breakup of that? X and Y. So X has to be, so 1:2, right? Overall, X needs to be 300. 1 second. So X, number of units of X to be sold is going to be 300 into 1 by 3. Number of units of Y is going to be 300 into 2 by 3. So this is going to be how much? 100 units of X, and this is going to be how much? 200 units of Y. Or in other words, if I sell 100 units of X and 200 units of Y, I will be able to break even. This is how you need to arrive at it. Are you guys clear with this? So the most important part when it comes to sales mix is that the calculation of break-even point. So break-even point formula is going to be your fixed cost divided by weighted contribution per unit. And remember one more thing. Suppose in the question contribution is not available, PV ratio is available, I can say simply this is nothing but, so break-even point in sales value is going to be fixed cost divided by weighted PV ratio. As simple as that. If you want the figure in value, instead of contribution per unit, use PV ratio. Clear with this, guys? But that has to be a weighted PV ratio because you need to consider all the products for recovery of your fixed cost. As simple as that, guys. Clear with this? This is all about this particular question, and using this question we learned the concept of sales mix. The other part of the question is fairly simple, right? In fact, we have done that also, right? The most important part is with respect to calculation of your break-even point. So now please go and update your library of adjustments. Write down sales mix hyphen calculation of profit and break-even point in different scenarios. Calculation of profit and break-even point in different scenarios, right? That's about this concept of sales mix. Look at this. We can just knock off all these concepts without mugging up anything. That's the beauty of costing, guys. Trust me. Costing, FM, these subjects should never be mugged up. Mugging up is not even a sin. I told you it's a crime. So you should never mug up in these subjects and all. As simple as that. So here the break-even point is what? Fixed cost by weighted contribution per unit or fixed cost by weighted PV ratio. How will you do that? Simple. The respective contribution per unit into the weights or the respected PV ratio into weights, and as simple as that, guys. Clear with this, right? And that's about this particular concept of sales mix and marginal costing, right? With this we have completed this particular concept called as sales mix. Now let's move on to another concept called limiting factor. We will do one concept called as limiting factor. Quickly we will revisit this area. So let's get started. So I will take this up here. 1 second. Okay, guys. So limiting factor. Okay. Now guys, let us say I deal with two products, A and B. Let us say the selling price is going to be 10 rupees for product A and 10 rupees for product B. The variable cost is going to be 6 rupees for product A and 4 rupees for product B. The contribution per unit is going to be 4 rupees for product A and 6 rupees for product B. Now, you guys tell me, these two products are there. Which product will I manufacture? Now, you might say, sir, product B, sir, I will manufacture because it gives me a higher contribution per unit. Now, I will say, why only product B? Product A is also giving me some positive contribution. So I will produce both A and B, no? Who is stopping me? Yes, I can sell as many number of units of B possible. I will also parallelly sell as many number of units of A possible. Guys, clear with this? So why should I limit my production to only one product? I can produce as many products as possible, right? So generally, when there is no constraint, no one is stopping you from producing a product which has a positive contribution. You can produce all the products which will generate a positive contribution. Are you clear with this? Now, let me add one more data here. Let us say both these products are produced by using a common raw material called X. Now, this X needs to be imported from, let us say, China, right? Now, there is some import restriction, and the Indian government has clearly mentioned that you cannot import beyond 10,000 kgs of raw material X, or in other words, raw material X is a scarce product. It is called as limiting factor. Are you clear with this? Any factor that limits your production or output is called as a limiting factor. In this scenario, your raw material is a limiting factor. So now you guys tell me, what is the total kgs of raw material available? 10,000 kgs. Clear with this, guys, right? And let us say to produce 1 unit of product A, I require 1 kg of raw material. To produce 1 unit of product B, let us say I need 2 kgs of raw material. And overall in the Indian market for product A, let us say I have a total demand of 2000 units, and for product B I have a demand of, let us say, 8000 units. This is the scenario. Now guys, first you tell me, in the market I have a total demand of 2000 units of product A and 8000 units of product B. Will I be able to fulfill the entire market demand? Is that possible right now? So to fulfill the entire market demand, sir, to produce 2000 units, 2000 into 1, I need 2000 kgs of raw material plus 8000 units of B, sir. 8000 into 2, 16,000 kgs of raw material. Overall 2 plus 16, I need a total of 18,000 kgs of raw material. If I have 18,000 kgs of raw material, I can satisfy the entire market demand for product A as well as product B. But now you tell me, how many kgs of raw material do I have? Only 10,000 kgs of raw material, which means raw material is a scarce component. I call that as a limiting factor. This is a factor that limits my production. In this case, what should I do? I should judiciously and very, very carefully, I should use my raw material. Now, how am I going to use it? Which means I need to use this raw material properly and very judiciously towards production, right? Now, you guys tell me, I need to prioritize, sir, which product should I produce first, A or B? Once I fulfill all the first priority product, then if any kgs of raw material is left, I will go to the second priority product. Now you guys tell me, which product should I manufacture first, raw material A or raw material B? We should do a ranking. Now, many of you might think, sir, first ranking will go to product B because it has a high contribution per unit. First produce this particular product B, then if you are left with any raw material, then you can produce product A. So which means product B should get the first rank, product B should get the second rank, priority. The answer is wrong. Why? Now you need to compute something called as contribution per limiting factor. What is the limiting factor here? Raw material. So contribution per kg of raw material. Here, product A, you generate 4 rupees by consuming 1 kg, which means 4 by 1. My contribution per kg of raw material is 4 rupees. Whereas product B, no doubt, you generate a contribution of 6 rupees, but this 6 rupees can be generated by consuming 2 kgs of raw material. 6 divided by 2, you get how much? Rupees 3 per kg. Now you guys logically think. Now every time I lift a particular kg of raw material from my stores and issue it for production, if I use it for producing product A, this kg of raw material, if it gets converted into product A, every kg of raw material used for product A can generate 4 rupees. Whereas every kg of raw material used for producing B can only generate 3 rupees. Why, sir? No doubt product B has an advantage of higher contribution per unit, but product A has an advantage of lower consumption per kg, which may lower consumption per unit. So which means in this case, so you need to consider both the contribution as well as the consumption. Hence, what we do is we do the ranking by considering contribution per limiting factor. In this case, contribution per kg of raw material. Literally, this 6 rupees can be achieved by consuming 2 kgs of raw material, or in other words, per kg of raw material used for producing product B, I can generate only 3 rupees, whereas the same raw material is used for producing product A, I can generate 4 rupees. So now what we do here is, now I do the ranking. So as per the ranking, the first priority will go to product A. So use all the kgs of raw material and try to fulfill the entire market demand of product A. 2000 units of product A you produce. If you are left with the balance kgs of raw material, then you go ahead and use it for producing product B. That is going to be the second ranking product. So the first step in questions which have limiting factor is, doing the ranking. Ranking should be based on what? Contribution per limiting factor. In this question, I told you the limiting factor is raw material. Now, maybe in some question, they could have given you the limiting factor could be labor hours, right? The total labor hours available is 10,000 hours. In that case, what you need to do? Example. So, the labor hours per unit will be given in the question. Arrive at the contribution per labor hour, do the ranking, and then you need to do the allocation. So, basically, guys, the first step that we need to do here is about what? So, the step number 1 is ranking. Now, step number 2 we need to do, which is allocation. Sir, how will I allocate? So, allocation of raw material to the products. Sir, using this 10,000 kgs, what is the best possible combination of product A and B that I can produce so that I will get the maximum possible profit? Now, for this, actually, I have a template here. Rank product kgs per unit, kgs, and cumulative kgs. Sir, what is this? A very, very proper and a structured way of cracking questions here. First, what is the first rank product? Product A, right? 1 second, I think I missed out one thing. Okay, so here I will write it down. Units, kgs per unit, kgs, and cumulative kgs. I will tell you what this is. Product A. Now, what is the maximum possible demand of a product A? 2000 units, right? So, 2000 units. Now, to produce 1 unit of product A, how many kgs of raw material do I need? It's given in the question, 1 kg. Which means to satisfy this entire 2000 kgs, 2000 units, how many kgs do I need? 2000 into 1. 2000 units. So till now, cumulative kgs I've consumed is how much? 2000 units. Next, what is the second rank product? B. Now, come from the reverse. After I produce A plus B, totally how many kgs of raw material would have been consumed? The total 10,000 kgs, right? The total 10,000 kgs, right? So this is not units, this is kgs. Now, out of this 10,000, already I would have consumed 2000 kgs for producing first product A, which means how many kgs are available for producing product B? Balance 8000 kgs only. Now, to produce every unit of product B, how many kgs do I need? 2 kgs of raw material, which means using this 8000 kgs of total raw material, how many units of B can I produce at max? 8000 divided by 2. Max, I can produce only 4000 units of product B. Are you guys clear with this? Or in other words, the most optimum allocation of this raw material is you produce 2000 units of A and then produce 4000 units of B. This combination will only give you the maximum possible profit. Now, if you deviate from this mix, definitely your profit will definitely reduce as compared to this particular allocation. Are you guys clear with this? So there are 2 steps involved in your limiting factor questions. Number 1, ranking your the products based on contribution per limiting factor, and step number 2 is allocation of your limiting factor to the products. Are you guys clear with this? In this scenario, right, what we did, I narrated one particular question, and based on this particular facts, we have seen that the best optimum possible production is going to be to produce 2000 units of A and 4000 units of B. So we are fulfilling entire product A's demand product B, out of 8,000, we can only produce 4,000. This is because of the constraint of raw material. Are you guys clear with this? And that is all about the concept of limiting factor. With this, any kind of sum you will be able to do. And in fact, in our courses, in our regular and EVO batches and all the sums we do here. But since this being a marathon revision, right, here also I have taken one numerical example to explain the concept of limiting factor. The same logic you can apply for in case of instead of raw material. Suppose in the question it is being mentioned that labor hours or machine hours is a limiting factor. In that case, automatically instead of raw material you can use your labor hours or machine hours, as the case may be. Calculate the contribution per labor hour or contribution per machine hour, do the ranking and do the allocation. As simple as that. Clear with this, guys? So with this we have also completed the next concept called as limiting factor. So let's go and tick off the scoreboard, right? So that's about this concept of limiting factor analysis. So now let's move on to the next concept called as shutdown point. Now what is this concept of shutdown point? Now I've clearly explained this in our concept decoder notes as well. The limiting factor is mentioned, shutdown point, right? So I have neatly condensed all the formulas and everything has been mentioned here. So all these things, whatever I've written down here, it was actually done during our, the batch, that is your regular and EVO batches and all. So we use the same book, in fact, for all our, regular batches as well, and even in our exam-oriented batch. But anyways, this concept of shutdown point, right, it is applicable under situation of off-season or recession. A company may need to evaluate whether it should shut down. Remember, it's a temporary closure, or continue with the operations. Now guys, what are they talking about in this particular scenario? Now this concept is called as shut down point. Now guys, now understand, in some extreme cases the market might be very, very dull. For example, COVID time. Now what happens, though my product is very, very good, it has all quality, it provides value addition to my customers, but still during certain time of recession, a perfect example is COVID, people might not be having the money to buy the product, though my product is very good in all other aspects. Now, in this case, COVID time, let us say for the next 3 months, I am expecting that, there is going to be a complete lockdown. My business is going to be dull. Now, after 3 months, once again, my business will pick up. Till now, my business is very good. Temporarily, for this next 3 months, right? Now, the market is going to be dull. I need to take a decision whether I should continue my operations for this next 3 months or I should keep my factory shut down. Clear with this, guys? This is called as shut down or continue decision. In this chapter, we're going to take decisions. That's all, right? Shut down or continue decision. Sir, after 3 months, I will continue. That goes without saying. This is a temporary or a short-term decision we are taking. In our subject, we only take short-term decisions. We don't take long-term decisions. Long-term decisions are taken in financial management. Only short-term decisions are taken in cost and management accounting. Now guys, now how do we do this? Simple, based on cost benefit analysis, right? What is this? Sir, if I shut down, what is going to be my benefit? What is going to be my cost? We need to compute. If my benefits are going to be more than the cost of shutting down, then I will definitely shut down. If it is the other way around, that is costs are greater than benefit, then I will continue. Are you guys clear with this? Now let me take an example. Now let us say I run a coaching institute. Example I'm giving you, right? In a face-to-face model, I have hired one classroom, and on an average, let us say 200 students generally come and attend my class. Now, during COVID, what happens? I got an inquiry only from 8 students. Everyone preferred online, right? I'm talking about a face-to-face batch. Now, only 8 students said, sir, we are living nearby in the same street. We can come, sir. Don't worry. Now, instead of 200 students, now I have a demand of only 8 students. In this scenario, now I'm going to take a call whether this particular batch or for this particular next 3 months, should I shut down or should I continue? Now, if I shut down the batch, what are all the benefits? I will write it down here. If I shut down the batch, because of shutting down, what are all the extra cost? I will write it down here. Now guys, let us say I'm running an academy with multiple faculties, right? Now, let us say I have fixed costs, right? There are two types of fixed costs. One is called as avoidable fixed cost. The other one is called as unavoidable fixed cost. Now, what are these two, sir? Example. Now, the same example of coaching institute. Now, let us say I'm going to cancel the upcoming batch, face-to-face batch. Because of this, can I go ask my landlord, sir, next batch is not going to happen, so I will not pay your rent for the next 3 months? Can I tell him that? Absolutely not. So clearly, rent is an example of unavoidable fixed cost. Whether you shut down or you continue, definitely this rent has to be incurred. Whereas, let us say I have faculties for multiple subjects and I'm going to pay them for every batch. If you take one batch, I will be paying you a fixed amount of so much. It is not dependent on the number of students. Example, I'm telling you. Suppose if I cancel the next batch, I need not pay my faculties, obviously, because the batch is not conducted. Clear with this, guys? Now, the faculty fee payment is an example of avoidable fixed cost. It is fixed cost only. Both rent as well as faculty payment are examples of fixed cost, but your faculty payment is avoidable in nature, rent is unavoidable in nature. Are you guys clear with this? If I shut down, I will be able to save my avoidable fixed cost. Are you guys clear with this? So the benefit of shutting down, there is only one benefit. What is this? Savings in avoidable fixed cost. Are you guys clear with this? Savings in avoidable fixed cost, right? Now, what are the costs if you shut down exclusively? What are the costs you are going to incur? Now, don't say unavoidable fixed cost. Unavoidable fixed cost, example, rent will be incurred whether you shut down or you continue. On the cost side, what you should mention, if you shut down, only because of shutting down, if you are incur specifically some cost, that alone should be captured here, because we're doing a cost benefit analysis. If I shut down, what is the benefit? If I shut down, what is going to be the cost we are going to compute, right? Now, let us say during COVID, right? Now, lockdown was there. Now, we couldn't move around. So, lockdown was there, let us say for 1 month. After this 1 month, now, what happened? If you are going to start your two-wheeler, right? Because you cannot move around, your two-wheeler would have been just like that. You would have kept it down, right, in your garage or in your parking area. After 2 months, if you start this two-wheeler, it will not start. So the first place you will go is the mechanic shed. Or in other words, basically, guys, this is the thing that happens for all machines. If you don't use a particular machine, then it requires some extra maintenance. Clear with this, guys? Similarly, if I am planning to shut down my factory for the next 3 months, I need to incur some extra cost which I will not be incurring if the business is running. Clear with this, guys? I need to do some trial run, extra overhaul, maintenance, lubrication, other things I need to do just to make sure that the machine will run after 3 months of shutting down. Clear with this, guys? So, or in other words, this is called as shut down cost. What do you mean by shutdown costs? The costs which are exclusively incurred if I am shutting down my business. Are you guys clear with this? So if I shut down, there is an exclusive cost which I incur. It is called as shutdown cost. So this is one cost which I incur only if I shut down. Clear with this, guys? Next, there is one more cost, opportunity cost. This is nothing but the contribution lost on shutdown period demand. What is this? Now, I told you, instead of 200 students during the shutdown period, or in other words, during this 3 months upcoming batch, I got inquiries from 8 students. Now, because I am shutting down, now what happens? I cannot generate the contribution on this 8 students also. Are you guys clear with this? So, if I shut down, what happens? I am losing out on the contribution that I could have otherwise generated on the shutdown period demand. Whatever less demand it is, on that I could have generated some contribution, that also I will be losing. Clear with this, guys? Right? So now there is one benefit and there are two costs here. If the benefits exceed the cost, then you can go ahead and shut down. If your costs exceed the benefit of shutting down, then do not shut down, go and continue. Clear with this, guys? But there will be one point where the benefits is equal to the cost, that is called as shutdown point, and at that point, whether you shut down or you continue, basically you will get the same result because your benefits is equal to cost. Now let me give you a numerical example. With the help of this, you will be able to understand. Now let us say, guys, right, this is example number 1. So I'm classifying this benefits and cost. Let us say avoidable fixed cost is equal to 1 lakh rupees. Sir, if you shut down, you will be able to save fixed cost of 1 lakh rupees. But what happens? Sir, exclusively for shutting down, you need to incur some extra maintenance. How much is that? 40,000 rupees. And contribution lost, how much is it? Let us say, sir, for the upcoming 3 months, I predict I'm going to get a demand of 8,000 units. So generally, sir, for this 3 months, generally 1 quarter, I get a demand of 70,000, 80,000 units generally. Whereas now I'm getting only 8,000 units. But if you shut down, that 8,000 units also cannot generate a contribution. Ideally, if I sell 1 unit, I could have generated 4 rupees of contribution. But since I'm shutting down, 8,000 into 4, I'm losing how much? 32,000 rupees. Guys, are you clear with this? So now total cost is how much? 72,000. Or in other words, if you see, if you shut down, how much amount you will save? 1 lakh rupees benefits, right? But because of shutting down, extra how much you lose? 72,000 net off. You have a net benefit. If you shut down, you save 1 lakh rupees, but extra you incur is 72 net off. That is on 28,000 rupees of net benefit. So now what will you say? Sir, the decision is please go ahead and shut down. Right? Because the benefit of shutting down exceeds the cost of shutting down. Are you guys clear with this? Now, let me give you a second situation. Sir, if I shut down benefits, avoidable fixed costs, I can save 1 lakh rupees. This will not change. Cost, shutdown cost is going to be equal to 40,000 rupees. This also will not change. Contribution lost. Suppose, let us say, during the next 3 months, I am predicting a demand of 20,000 units. I am predicting a demand of how much? 20,000 units. Each unit, I will be losing contribution of how much? 4 rupees. So literally, the contribution loss is going to be how much? 20,000 into 4, 80,000 rupees. Clear with this, guys? In this case, what is the total amount I'm losing if I shut down? 1,20,000 rupees. But what is the benefit I'm getting because of shutting down? Only 1 lakh rupees. Here, the cost of shutting down exceeds the benefits of shutting down. In this case, what I will do? Sir, please do not shut down. It is better to continue. Are you guys clear with this? Right? Now, guys, why did we change the decision? Why did we change the decision? There is only one factor that played a role. Avoidable fixed cost did not change. Shutdown cost did not change. The entire thing here changed because of the shutdown period demand, volume. Volume is the biggest hero of this chapter. Now, what happened here? If the shutdown period demand was only 8,000 units, right? Then in that case, I didn't lose much. Overall, I was losing to 72,000, right? But I was getting 1 lakh. Here, now since the shutdown period demand increased, so the contribution lost, opportunity cost increased significantly. Hence, what has happened? The costs exceeded my benefits, and hence what happened in this case? I felt no, please don't shut down, because if you shut down, what happens? You lose 20,000 units, and every unit you generate a contribution of 4 rupees. You have lost 80,000 rupees of contribution. Because of this, the entire decision changed. Are you clear with this? Or in other words, there is one point where my benefit is equal to cost. That point is called as shutdown point. Or in other words, shutdown point is nothing but how much demand of during the shutdown period do you expect, so that your benefit will be equal to cost. That is, the demand level at which my benefits is equal to the cost is called as shutdown point. How will we do this? Simple, equate the two. So at the shutdown point, benefit should be equal to cost. So here I will say 1 lakh should be equal to 40,000 plus 40,000 is this, plus I need to calculate the shutdown point only. I will keep the number of units as x into every unit will generate 4 rupees, or can I say this is nothing but 40,000 plus 4x. Guys, clear with this? So now can I say, I'll put it on to the other side, 4x is equal to, now this goes to the other side, 1 lakh minus 40,000. So 1 lakh minus 40,000, or in other words, x is equal to 1 lakh minus 40,000 divided by 4. Are you guys clear with this? Or in other words, x is equal to 1 lakh minus 40,000 is 60,000 rupees divided by 4. How much is this? 60,000 by 4. It's going to be 15,000 units. Are you guys able to understand? So my shutdown point is equal to 15,000 units. Sir, with this shutdown point, what can we conclude, sir? What can we conclude? Sir, shutdown point is going to be equal to 15,000 units. What can we conclude, sir? Simple. Sir, shutdown point is 15,000 units. Suppose your expected demand, sir, during this next quarter, I am expecting the expected volume is less than your shutdown point. In that case, market is not vibrant. You can just go ahead and shut down. It is better to shut down, right? Suppose your expected demand for this upcoming quarter or the next 3 months or 2 months, as the case may be, is greater than the shutdown point. In that case, what will you do? Definitely you should continue, because the cost of shutting down will exceed the benefits of shutting down. Clear with this, guys? So if your expected demand, right, shutdown period demand is less than the shutdown point, it is better to shut down. If your expected shutdown period demand is less than the shutdown point, better to shut down because market is not vibrant. Now if your expected shutdown period demand is more than the shutdown point, it is better to continue. And at the shutdown point, whether you shut down or you continue, you will get the same result. Are you guys clear with this? Or in other words, guys, nothing. Shutdown point is nothing but, now in the numerator you had 1 lakh minus 40,000. What is 1 lakh? Avoidable fixed cost. Correct? 1 lakh was avoidable fixed cost. What is this 40,000? This is nothing but shutdown cost divided by 4. What is this 4 rupees? This is nothing but contribution per unit. Are you guys clear with this? Or in other words, my shutdown point is nothing but avoidable fixed cost minus shutdown cost divided by contribution per unit, right? This is all the formula, guys. Or in other words, this is very similar to your indifference points analysis. Difference in fixed cost divided by difference in contribution per unit. But here, look at this. This is nothing but difference in fixed cost divided by difference in contribution per unit. But if I shut down, I don't have a contribution per unit. So there is only one contribution per unit. Directly you can say difference in the two fixed costs. What are the two fixed costs here? Avoidable fixed cost minus shutdown cost divided by your contribution per unit itself. Or in other words, your shutdown point is an extension of indifference point analysis, and directly you can arrive at the shutdown point by using this formula: avoidable fixed cost minus shutdown cost divided by contribution per unit. With this shutdown point, what can you take a decision if during the upcoming 3 months or 2 months, as the case may be, it will be given in the question. For the shutdown period, if the expected demand is less than the shutdown point, market is not vibrant, go ahead and shut down. If the expected demand during the shutdown period is more than the shutdown point, it is better to continue. If your expected demand is exactly equal to the shutdown point, whether you shut down or you continue, you will get the same result. Are you guys clear with this? This analysis is called as shutdown or continue decision using the concept of shutdown point. As simple as that, guys. Beyond this, there is nothing here in this question, in this particular concept. Now if you go and read all these things, you will be able to understand. It is applicable under situation of off season or recession. The company may need to evaluate whether it should shut down temporarily or to continue the operations. Now all these things has been given, and finally the shutdown point can be calculated using this formula: avoidable fixed cost minus shutdown cost divided by contribution per unit. Now shutdown point is also nothing but volume only, demand only. If you want to express this in units, in the denominator use contribution per unit, or if you want to express this in value, use PV ratio. As simple as that. Clear with this, guys? If the expected demand is less than the shutdown point, it is better to shut down. If it is equal to shutdown point, whether you can shut down or continue, it will give you the same result. If the expected demand is greater than the shutdown point, it's better to continue. And in the doubt buster segment, clearly I have mentioned here, what is this? The shutdown point concept is based on indifference point concept, and the formula is derived from indifference point formula, change in fixed cost divided by change in contribution per unit. As simple as that, guys. Beyond this, there is nothing great at all. So now let's quickly go and solve one numerical problem. So please take question number 18. One second. It's okay. We will take question number 18 from our CMA Inter book, right? Paper 8, cost accounting. Please take question number 18. So I have handpicked all these questions. So just so that we cover. Now for CA Inter students, please don't think that, sir, this is not applicable for me and all. Absolutely not. Absolutely not. In fact, in the CA Inter material also, few CMA questions I've kept for a simple reason, right? Separate books only, but still I've kept because in past I've noticed one trend. If a good question comes in CMA intermediate, now our CA institute is keeping it here, right? And at times CA Inter questions are being tested in CMA intermediate. So these kind of shuffling keeps happening. So please do not worry. If I'm doing something, it's absolutely applicable for your syllabus. Clear with this, guys? So now let's go and do this question number 18. Please remember this question number 18. We are doing it from CMA intermediate paper 8, cost accounting. That book, you can please download it. So it's on page number 275, right? So this book, cost accounting, paper 8, cost accounting, question bank. From here we are going to do this question, right? So quickly let's get started. One second, I'm taking out the question for you. Okay, so yes, question number 18. It's on page number 275. Mr. Young has 1,50,000 rupees of investment in business. He wants a 15% profit in his money. From an analysis of recent cost figures, he finds that his variable cost of operating is 60% of the sales. Means what? Variable cost ratio is 60%, which means PV ratio is going to be 40%. And fixed cost is going to be how much? 75,000. Show the supporting computations for each of the solution. Okay, what sales volume is required to break even? What sales volume is required to obtain his 15% return on investment, right? These two are general questions, right? This is on break-even point. This is on calculating the required sales to earn a profit. Now the most important part, shutdown point, comes here in point number C. Mr. Young estimates that even if he closed the doors of his business, he would incur 25,000 rupees as expenses per year. At what sales would he be better off by locking his sales up? Now they are using some technical language and all, nothing great. No, the best part is nowhere in the question they have used the word shutdown point or anything, right? But ideally this question comes from your shutdown point analysis only. Now what they are saying, first of all, understand. Now in this particular question there is no contribution per unit, so you should use your PV ratio. How much is the PV ratio? The variable cost ratio is 60%, which means my PV ratio is going to be 40%. As simple as that. Perfect. That's all it is. Next. Now, what is the formula for calculating your shutdown point? Shutdown point is going to be avoidable fixed cost minus shutdown cost divided by PV ratio. Correct, guys? Now, carefully read this question. How much is my total fixed cost? 75,000 rupees. Now they have said, even if I closed the doors of his, even if he closed the doors of his business, which means what? Even if he shuts down, he would incur 25,000 rupees per year. Means what? 25,000 rupees is unavoidable fixed cost. Clear with this, guys? So out of the total fixed cost of 75,000, 25,000 rupees is unavoidable, which means the balance 50,000 could be avoided if he shuts down the business, right? So avoidable fixed cost is going to be 50,000 rupees. Are you guys clear with this? Right? Now, shutdown cost is how much? Don't say shutdown cost is 25,000. Shutdown cost means what? A cost which I will incur only if I shut down. In this case, I am not shutting down my business at all. I mean, in this case, I am not going to incur any specific fixed cost or any specific cost if I shut down. They have not given anything. So in this case, I will take my shutdown cost as 0, right? So by substituting it here, avoidable fixed cost 50,000, right, minus shutdown cost 0 divided by PV ratio 40%. So how much does it come out to? 50,000 by 0.4, you get 1,25,000 rupees as your shutdown point. Are you guys clear with this? Now here they have used a different formula and all, but ultimately the answer matches. But trust me, this is the correct formula. Please write that only in your exam. Now 1,25,000 rupees is the shutdown point. What is the meaning of this? Sir, if in the expected upcoming next few months or in the year, as the case may be, right, for the temporarily in the next period, if your expected demand is less than 1,25,000, please shut down your business. If it is more than 1,25,000, please continue. If it is exactly equal to 1,25,000, whether you shut down or you continue, the result will be the same. Are you guys clear with this? This is the concept of shutdown point, and many students make a mistake in arriving at the correct avoidable fixed cost and the shutdown cost. They generally take a wrong figure. 25,000, they take it as a avoidable fixed cost directly. No, it is unavoidable fixed cost, which means out of the total fixed cost, 25,000 will be continued to incur even if I shut down, which means it is unavoidable, which means only the balancing figure 50,000 is avoidable fixed cost. And shutdown cost would be specifically given in the question. You can't assume anything. If it is not given in the question, take it as 0. As simple as that. Clear with this, guys? That is all about this particular question. Right here we are focusing on the shutdown point analysis, and as simple as that, guys. Very, very simple. And we have taken one question from CMA Intermediate paper 8, right? But don't think it is not applicable. Please do not think. Even CA Inter students can definitely follow this question, right? It is 100% applicable for your examinations, because these kind of questions, right, gets tested across different courses, CA, CMA. In fact, I've also noticed in US courses like SEMA and all, certain questions, if it gets tested in one attempt, our CA Institute or CMA Institute are also taking, because globally costing FM, these questions are all, I mean, these subjects are all same, uniform. It is not country dependent. It is globally, it's going to be more or less the same. Hence, these kind of question gets tested in all professional courses that are having these subjects in their syllabus. Clear with this, guys? So with this, we have completed this particular question number 18. Please go and update your library of adjustments. Please write down. Please write down calculation of shutdown point. Please write down calculation of shutdown point. Right, fine, guys. So that's about this particular concept of shutdown point. So with this, we have completed this concept of shutdown point as well. Now let's move on to the next concept. So now let's move on to the next segment of discussion, which is marginal costing versus absorption costing. Now, guys, this segment of discussion alone goes on to achieve the objective of your profit computation, your stock valuation and profit computation. All other aspects of this chapter will go on to achieve the objective of decision making. Only this segment of discussion goes on to achieve the objective A of our subject, which is stock valuation and profit computation. Now, guys, in this segment, right, we are going to see how stock gets valued in marginal costing and absorption costing, and accordingly we will be preparing this income statement under marginal costing and as per absorption costing, and finding out the difference between the profit reported under these two methods. And we will also be seeing the reason why each of these two methods or systems of costing, right, report different profits. Ideally they are not methods, they are called techniques of costing. Now, right, once again, guys, this is a common segment in your CA Intermediate, your paper 4 cost and management accounting, in your CMA Intermediate paper 8 cost accounting, and paper 12 management accounting. It's a common area. Now, guys, now basically cost is broadly classified into two. manufacturing cost and non-manufacturing cost. Basically, manufacturing cost means cost that is incurred inside the factory, and non-manufacturing cost refers to all the costs incurred outside the factory, basically in your corporate office administration overheads and your sales depot selling overheads, right? Now, generally all non-manufacturing costs are considered as period cost, which means they are not considered for the purpose of stock valuation. They are P&L items. They are not trading account items. They are not considered for the purpose of stock valuation, right? However, CMA Institute, right? CMA students, generally CMA Institute considers administration overheads also as a product cost. However, in this segment of discussion, even in CMA, they have taken it only as period cost. Now, administration overheads and selling overheads are always considered as period cost, both under marginal costing as well as under absorption costing, right? Now, manufacturing cost, that is cost incurred inside a factory, can be classified into direct material, direct labor, direct expenses, and production overheads. Now, this production overheads can be further categorized into two: variable production overheads and fixed production overheads. Now, guys, under absorption costing, right? Now, every unit of stock is valued at full manufacturing cost, or in other words, right? Product cost means all the costs incurred inside the factory. That is direct material, direct labor, direct expense, called as prime cost, plus entire production overheads, which means variable as well as fixed component of production overheads. Whereas marginal costing is dead against it. It says, no, every unit of stock can be valued at direct material, direct labor, direct expense, and variable production overheads. However, fixed production overheads should never be treated as a product cost, and it should never be unitized for valuing every unit of output. Who says this? Marginal costing. Clear with this, guys? Because marginal costing is completely against unitizing your fixed cost. Now, if you are incurring a fixed cost, even though if it is incurred inside the factory, I should treat it only as a period cost. I should never treat it as a product cost. Clear with this, guys? This is what marginal costing says. Or in other words, direct material, direct labor, direct expense, and variable production overheads, these four components are always treated as a product cost, both under marginal costing as well as under absorption costing. The only issue or the difference between marginal and absorption costing lies with respect to treatment of fixed production overheads. Now, in fixed production overheads, absorption costing consider this as a product cost, whereas marginal costing consider this as a period cost. Marginal costing literally says anything which is fixed should never be unitized, should never be considered as a part of product cost. It should always be period cost. Clear with this, guys? Or in other words, under absorption costing, every unit of stock or every unit produced is valued at full manufacturing cost. Whereas, can we say, marginal costing values every unit produced at variable manufacturing cost. Clear with this, guys? Variable manufacturing cost. Don't say variable cost. Why, sir? Now, administration overheads, selling overheads. Here also, some variable component could be there. But marginal costing says anything incurred outside the factory should never be considered as a part of stock valuation. Clear with this, guys? So, AOH and SOH are always period cost, irrespective of whether it is variable component or fixed component. So, marginal costing is very clear. It says stock should be valued at variable cost, that too incurred inside the factory. So, variable manufacturing cost alone is considered for the purpose of stock valuation. Clear with this, guys? Right? Under marginal costing. So, clearly understand, with respect to non-manufacturing cost, AOH, SOH, always treated as period by both the systems of costing. And with respect to prime cost components and variable production overheads, always considered as a product cost under both the systems of costing. The only issue with respect to treatment of fixed production overheads, now absorption costing consider this as a product cost, whereas marginal costing consider this as a period cost. Simple, guys. Now, there is a famous movie dialogue in Tamil. So, there is a movie dialogue that says, நண்பன்ல எங்கம்மா நல்ல நண்பன் கெட்ட நண்பன் நண்பனாலே நல்லவன் தான். Right? For those who do not understand Tamil, it's okay, fine, just a movie reference. Now, similarly, marginal costing says fixed la engama product period fixed naale period da. So fixed cost means period cost, right? Now whether it is incurred inside the factory, outside the factory, marginal costing is completely dead against unitizing your fixed cost. It says simple, if it is fixed, even though if it is incurred inside the factory, I will only consider that as a period cost. Clear with this, guys? Or in other words, in marginal costing, every unit of stock is valued at variable manufacturing cost, whereas absorption costing values every unit at full manufacturing cost. The only difference between the two is with respect to treatment of fixed production overheads. All other areas, marginal costing and absorption costing are agreeing. The only disagreement is with respect to fixed production overheads. And we all know in absorption costing, what we do is that, right? So we arrive at the predetermined rate and all, budgeted fixed overheads divided by your budgeted base quantity. Using absorption technique, we charge it to the product. At the end of the period, you take the absorbed overheads, compare that with actual overheads, arrive at under or over absorption, give the adjustment. Here in marginal costing, there is no question of absorption itself. Only then will the question of under or over absorption come. So all these things are not even there in marginal costing. Only in absorption costing that issue is that. Clear with this, guys? Now with this background, let us go and do one numerical problem. With the help of this numerical problem, we will clearly understand the difference between your marginal costing and absorption costing. Why will there be a difference in the profit reported? If so, why? And all these things we will clearly understand. This is a masterpiece question, right? It has all the variety combinations, all the different kinds of combinations possible, right? And with this, the entire concept of marginal and absorption costing will be covered here, right? So please go to your CA Intermediate Solved Question Bank, volume number 2, and please go to question number 27. It's on page number 449. This is equally applicable for CMA students. So the kind of questions which I am picking here in the marathon revision is purely which is common for everybody, right? If there is something which is not common, I will clearly indicate. You need not have to worry about that, right, guys? So now on that note, let's get started with question number 27. Now, from the following data, compute the profit under marginal costing and absorption costing and reconcile the difference in profit. Now, the selling price per unit is how much? 8 rupees. The variable cost is 4. Fixed cost is 2. Assume all these are manufacturing costs incurred in the factory. Literally, guys, which means what? The total cost of production, the full cost, full manufacturing cost is how much? 6 rupees. Right? So under absorption costing, every unit of stock will be valued at 6 rupees, whereas under marginal costing, every unit of stock will be valued only at 4 rupees. Perfect. Now, the normal volume of production is 26,000 units per quarter. Every quarter, I plan to produce how many units? 26,000. Normally, this is the production level. The opening and closing stock consists of both finished goods and equivalent units of WIP as follows. Literally, what they have said. Q1, Q2, Q3, Q4. 4 quarters they have given. Quarter wise, how much is the opening stock? How much is the production? How much is the sales? How much is the closing stock? Everything is given. Q1, no opening stock. 26,000 units I produced and I sold entire 26,000 units, which means I'm left with no closing stock. Closing stock of Q1 becomes opening stock of Q2, 0. Plus production is how much? 30,000. So I have 30,000 units, out of which I have sold 24,000 units, which means units unsold. Closing stock is 6,000 units. Now this becomes the opening stock for the next quarter. So 6,000 plus 24,000 they have produced in that quarter. Overall, how many units are available for sale? 30,000. Out of this, they have sold only 28,000, which means the balance 2,000 is the closing stock, becomes the opening stock for the next quarter, right? Add 30,000. Overall, 32,000 units are available for sale. They have sold entire 32,000. Hence, closing stock is 0. Clear with this, guys? Quarter wise, they have clearly given opening stock, production, sales, closing stock. All the data is given. Now, what we need to do, quarter wise, we need to compute the profit. First under marginal costing, then under absorption costing. We will see what is the difference between the two. Clear with this, guys? Now, remember, in marginal costing, every unit of stock will be valued at what? 4 rupees. Clear with this, guys? Please have this very, very clearly. Now, one more thing in this question. Now, how much will be the fixed cost? Now, they have not given anything in specific. So, clearly we know normal production volume is how much? 26,000. So 26,000 per quarter. So 26,000 into 2, comes out to rupees 52,000. So quarter wise 52,000 rupees is going to be my fixed cost in total. Clear with this, guys, right? I will take this. Now with this, let us go and prepare the profit statement under marginal costing system quarter wise. Now first, sales figure. How much is the sales figure? Respective number of units multiplied by the selling price 8. So 8 into 26,000 is equal to 2,08,000. So 24,000 is equal to 1,92,000. 28,000 is equal to 2,24,000. 32,000 is equal to 2,56,000. Literally quarter wise sales figure is done. Now from your sales, you should subtract the cost of goods sold, correct? Only then you will arrive at, ideally speaking, only then you will arrive at your correct profitability. So for the units sold, I should subtract, right, whatever is the cost of goods sold. But remember, every unit should only be valued at a variable manufacturing cost. Now first you guys tell me, how will I be valuing my cost of goods sold? Simple. Cost of goods sold is what? Literally this is my FG area. I have my opening stock plus the current year I have some production. Right, this is the total units available for sale. Out of that, I have sold some units, right? I have sold some units and the balance is my closing stock. Can I say the cost incurred in respect of units sold is going to be opening stock plus the current year cost of production minus closing stock? Agreeing with me? If I do this, literally I will be able to arrive at the cost of goods sold. But remember, all these units should be valued at 4 rupees variable cost. Clear with this, guys? So opening stock plus variable cost of production minus closing stock, I will arrive at variable cost of goods sold. Are you guys clear with this? So literally for Q1, opening stock is 0. Right? Now variable cost, I mean per unit is how much? 4 rupees. Right? So variable cost of production is at the rate of 4 rupees. Now what we need to do, everything, opening stock should be valued at 4 rupees, closing stock should be valued at 4 rupees. Now come on, tell me, now every quarter how much is the opening stock? The first quarter 0, second quarter 0, third quarter 6,000 units. So 6,000 units each should be valued at 4. So 6 into 4 is 24. Fourth quarter 2,000 into 4, it's going to be 8,000. Clear with this, guys? Similarly, so number of units of production, variable cost of production. So every unit should be valued at 4 rupees. 4 into 26,000 is equal to, you get 1,04,000. 30,000 is equal to, you get 1,20,000. 24,000 is equal to, you get 96,000. And 30,000 is equal to, you get 1,20,000. Clear with this, guys? Similarly, closing stock, first quarter 0. Second quarter 6,000. So 6,000 into 4 is 24,000. 2,000 into 4 is 8,000. And 0 is the closing stock in Q4. That's going to be 0. So literally the variable cost of goods sold is going to be how much, guys? Variable cost of goods sold, right? It's going to be opening stock plus current year cost of, I mean the variable cost of production for that quarter minus closing stock. If you adjust 0 plus 1,04,000 minus 0, it's going to be 1,04,000. Here 0 plus 1,20,000 minus 24, it's going to be 96. So 24,000 plus 96,000. Right, you get how much? So 24 plus 96, you get 1,20,000 minus 8,000, you get 1,12,000. Right, similarly 8,000 plus 1,20,000 minus 0, you get 1,28,000. Literally quarter wise now we have arrived at variable cost of goods sold. Clear with this, guys? Are you all able to understand? So now sales minus variable cost of goods sold, call it as gross contribution. It's not the final contribution. Why? Till now we have only considered the variable manufacturing cost. Now there could also be some variable SOH, AOH and all. Right? Only if I subtract all my variable cost from my sales, I will arrive at my net contribution. Till now we have only adjusted for what? The variable cost incurred inside the factory. Hence I call this as gross contribution. So sales minus variable cost of goods sold, 2,08,000 minus 1,04,000 is 1,04,000. 1,92,000 minus 96 is 96,000. 2,24,000 minus 1,12,000 is 1,12,000. And 2,56,000 minus 1,28,000 is 1,28,000. Clear with this, guys? Now from this further subtract variable selling and distribution cost, right? Variable cost incurred outside the factory, that is variable AOH, variable SOH. In this question nothing is there, hence I am putting this as nil. From this, you will arrive at the net contribution. It's nothing but the same figure because there is no variable selling and distribution cost. Clear with this, guys? Now, from my contribution, now I should subtract my fixed cost. Fixed cost incurred where? Whether inside the factory or outside the factory. Anywhere you incur, I am not bothered about the location. Fixed means period with respect to marginal costing. So quarterly, how much the fixed cost? We saw this 26,000 into 2, it was 52,000. So directly go ahead and subtract 52,000 every quarter. So now what you get is the profit, quarter-wise profit reported under marginal costing. Are you guys clear with this? As simple as that. Simple, same statement. Sales minus variable cost gives you contribution, minus fixed cost gives you profit. The same thing we are doing, but since this has stocks and all, here alone extra thing we are doing, variable cost of goods sold first we are computing. How do we do that? Opening stock plus variable cost of production minus closing stock, you get variable cost of goods sold, right? Sales minus variable cost of goods sold, you get gross contribution. From that, further subtract variable cost incurred outside the factory, you get the net contribution. From that, you subtract fixed cost, you arrive at the profit. Everything is same, but here the manner of presentation alone differs when you have stocks here. Are you guys clear with this? That's about it, nothing beyond this. Now quarter wise we have arrived at the figures, that is a profit reported under marginal costing: 52,000, 44,000, 60,000 and 76,000. As simple as that. Clear with this, guys? Next, now we need to compute the profits under absorption costing. Now before we do absorption costing, first you should understand one thing. Under absorption costing, every unit of stock is valued at how much? 6 rupees. Now also remember one more thing. In absorption costing, what we use is we use predetermined rate to absorb the fixed production overheads. Correct? Now for that we need to know the budget fixed cost, the budget fixed overheads. We need to arrive at it. Clear with this, guys? Now divided by the budget units and all we do. Accordingly we arrive at the predetermined rate. So that is how we need to do it. Now in this question, right, nothing is specifically given with respect to how much is the budgeted fixed overheads and all. Nothing is given. So we will assume that the budgeted fixed overheads is 52,000 rupees. How did we get 52,000? 26,000 units per quarter into 2 rupees. You get 52,000 per quarter. Guys, clear with this? And actual overheads incurred was also 52,000 rupees. In the absence of information, generally you can assume, right, your budgeted fixed overheads is equal to actual fixed overheads. Ideally, this is a discussion which is covered in overheads, which we have seen in detail in our regular classes, right? But I just want to set the context right even in this marathon. That's the reason this is a standard assumption you will take. Clear with this, guys? Now with this, first we should compute how much is the under or over absorption. How will you compute under or over absorption? Absorbed overheads should be compared with actual overheads, and based on this you will arrive at under or over absorption. Now the predetermined rate is 2 rupees, right? Absorbed overheads is going to be, right, your predetermined rate into actual production. So quarter wise you should arrive at the absorbed overheads first. So 2 into 26,000, 2 into 30,000, 2 into 24,000, 2 into 30,000 will be the absorbed overheads for the respective quarters. First we should compute under or over absorption. So absorbed overheads is going to be actual output into predetermined rate. So actual output we saw here 26,000, 30,000, 24,000, 30,000, right? Multiply that with 2 rupees of predetermined rate. How much you get? Here if you look at it, it's going to be 52,000 for the first quarter. Second quarter it's going to be how much? 30,000 into 2, it's going to be 60,000 here. Look at this, it's going to be how much? So it's going to be 60,000. For the third quarter, how much is it going to be? So 24,000 into 2, it's going to be 48,000. And for the fourth quarter, how much is that going to be? 30,000 into 2, it's going to be 60,000 rupees. Clear with this, guys? Right? Now what is the actual fixed overheads for every quarter? In the absence of information, we said budget is equal to actual. Every quarter it was 52, 52, 52 and 52. Clear with this, guys? Which means how much the under or over absorption we need to calculate. Now for Q1, actual is 52, absorbed is also 52, which means there is no under or over absorption. In quarter 2, actual was 52, absorbed was how much? 60,000 rupees, which means absorbed is more than actual. There is an over absorption to the extent of 8,000 rupees. Clear with this, guys? For Q3, Actual was 52,000, absorbed was only 48,000, under absorption to the extent of 4,000 rupees. And for Q4, 52 is the actual, absorbed was 60,000, over absorbed to the extent of 8,000 rupees. Clear with this, guys? So now literally quarter wise we have computed the under or over absorption, because this is an adjustment we need to do at the end. Now guys, coming back to the profit statement under absorption costing system. First, sales figure, you can just do it. The respective selling price multiplied by the respective units sold, you will be getting it. Right? From sales, if you subtract the cost of goods sold, right? From the sales, if you subtract cost of goods sold, right, you will arrive at the gross profit. Visualize your trading account, right? From the sales, you should subtract your cost of goods sold, you will arrive at what? Your gross profit. Now guys, under absorption costing, every unit is valued at how much? 6 rupees, right? So what I will do here, so opening stock is valued at 6 rupees, current year units produced is also valued at 6 rupees, and even the closing stock is valued at 6 rupees. So the respective units, right, multiplied with 6 rupees, I will arrive at the respective figures. For example, here opening stock value will be 6 into first quarter is 0, second quarter is 0, third quarter is 6,000. So 6,000 into 6 gives you how much? 36,000 rupees is the value of opening stock for Q3. And for Q4, it's going to be 6 into 2,000, it's going to be 12,000 rupees. Clear with this, right? Now, cost of production, here you look at this. So 26,000, so 6 into 26,000 gives you 1,56,000 for Q1. So it's 1,56,000 for Q1. For Q2, how much is that? 30,000 into 6, so how much is that? 1,80,000. For Q3, how much is that? So 24,000. So 24,000 into 6 is 1,44,000. And for Q4, how much is it? It's going to be 30,000. So 30,000 into 6 gives you how much? 1,80,000. Clear with this, guys, right? And closing stock, similarly. So 6 into 0 is 0. 6 into 6,000 is going to be 36,000. Here you get this closing stock 36,000. And 6 into 2,000 gives you how much? 12,000 rupees, right? And in Q4, it is nil. So opening stock plus current year cost of production minus closing stock, if you do, you will arrive at the cost of goods sold for the respective quarter, right? Sales minus cost of goods sold, you will arrive at the gross profit. Gross profit is only reported in your trading account. From your gross profit, subtract all the non-manufacturing costs, selling and administrative expenses. Here variable or fixed, everything, irrespective of the nature of variable or fixed. We don't classify here as variable, fixed. Any cost incurred outside the factory comes in your P&L account. Clear with this, guys? You subtract, in this case it is nil. But remember, one more very important adjustment you need to do, which is with respect to under or over absorption. Ideally, all these things are a subject matter of discussion in your overheads area. Right? So under or over absorption, Q1, there is no adjustment. Q2, now what I would have done, I should have accounted only for 52,000. I have accounted how much? 60,000 already, which means I need to reduce the cost to the extent of 8,000 rupees. Reduction in cost will result in increase in profit. So add 8,000 rupees. So over absorption is added to the profit or reduced from the cost. Since you're computing profit directly, add it. Are you guys clear with this? All these are very technical discussion in your overheads area, right? And I hope, since this being a marathon, I'm not getting into too many details with respect to this area, because it's covered in overheads actually. Clear with this, guys? Next one, with respect to quarter 3, you should have accounted for 52. You have accounted only for 48, which means 4,000 rupees is under absorbed, which means now you need to account for, you need to introduce cost to the extent of 4,000 rupees. So adding to the cost will reduce your profit. So 4,000 should be subtracted. Next one, 52,000 actual should have been accounted, but we have already accounted 60,000, which means 8,000 rupees of cost should now be reduced. Reduction in cost will result in addition in your profit. So 8,000 rupees should be added. Clear with this, guys? So from the gross profit, if you make the following adjustments, your net profit ideally that you will get is minus 52,000 in Q1, 56,000 in Q2, 52,000 in Q3, and 72,000 in Q4. Clear with this, guys? So these are all the profits reported under absorption costing, right, for each of the 4 quarters. Clear with this, guys? This is what it is. So now first we have prepared, this is not minus 52. So this is ideally, this is not minus 52, this is positive only. 52,000 minus 0 is 52,000. 48,000 plus 8 is 56,000. 56 minus 4 is 52, and 64 plus 8 is 72. Clear with this, guys? Now what happens? Now you tell me, is the profit reported under marginal costing and absorption costing the same? Here we have different figures. 52, 44, 60, 76. Here we have 52, 56, 52, 72 and all. The profit is different. Now, why is there a difference between the profit reported under marginal costing and absorption costing? Some of you might be thinking, sir, this is on account of under or over absorption. Absolutely not. Now, in marginal costing, right, we subtract the actual overheads. Whereas in absorption costing, we consider absorbed overheads, but at the end of the year, we match the absorbed with actuals. For example, here in Q2, I would have accounted for 60, but I compare it with actual and I say, look, by mistake, I accounted 60. So now I will reduce my cost to the extent of 8,000 and net off, I end up only accounting for actual overheads. Clear with this? So clearly understand, under or over absorption is not the reason for the difference between your marginal costing and the absorption costing profit. Sir, then what is the reason for difference? There is only one reason for difference, which is nothing but your difference in stock valuation. Now guys, in marginal costing, fixed production overheads is not considered for the purpose of stock valuation, whereas in absorption costing, the fixed production overheads is also unitized and it is considered for the purpose of stock valuation. Agreeing with me on this, right? Now what happens? Always every unit of stock is valued more under absorption costing and it is valued less under marginal costing. Do you agree with me on this? Yes, absolutely, because every unit of stock is valued at 6 rupees under absorption costing, whereas every unit of stock is valued only at 4 rupees under marginal costing. Or in other words, absorption costing always values every unit of stock at 2 rupees more as compared to marginal costing, right? Now, what happens? In Q1, now what happens? Opening stock is how much? 0. Closing stock is how much? 0. Now understand one thing, guys. Opening stock is on the debit side. Closing stock is on the credit side. Now in this case, there is no opening and closing stock at all, right? Hence what happens? Net stock is not there. Because of this, there is no more stock valuation or under stock valuation. Hence, in the first scenario, the profit reported under marginal costing 52,000 is exactly equal to the profit reported under absorption costing 52,000. Sir, can you elaborate more? Don't worry, the second quarter we will take. The second quarter, what happens? Opening stock is 0. Closing stock is how much? 6,000. Closing stock is on the credit side, right? Now, credit side, 6,000 units are there. Every unit is valued at 2 rupees more, where under absorption costing. So 6,000 into 2, how much is it? 12,000 rupees. So 12,000 rupees is more on the credit side, only under absorption costing. Hence, clearly, absorption costing will be reporting a more profit to the extent of 12,000 as compared to marginal costing. If you want, you can go and check it. Marginal costing profit is how much? 44,000. How about absorption costing? 56,000. 56,000 minus 44,000. How much is this? 12,000 rupees. Why, sir? Because there is a net closing stock and the closing stock is on the credit side and always stock is valued more under absorption costing. So 6,000 into 2, 12,000 rupees is the difference. This is what I would have mentioned here, right? There is a net closing stock of how much? 6,000. So 6,000 into 2, 12,000 rupees is the difference in profit. Clear with this, guys? Let's go to the third scenario. Now, under third scenario, what happens? Opening stock is 6,000, closing stock is 2,000. You have both opening and closing. Now you guys tell me, opening stock is how much? 6,000 units. Closing stock is how much? 2,000 units. If you net off the two, there is a net opening stock, correct? The opening stock is more than the closing stock. Net opening stock is how much? 4,000 units. This is on the debit side. And always remember, stock is valued more only under absorption costing. So 4,000 into 2, how much is it? 8,000 rupees is more on the debit side, where under absorption costing, right? Now, when the debit side is more, obviously the profit will reduce. Hence, in this case, your absorption costing will be reporting a lesser profit than your marginal costing, exactly to the extent of 8,000 rupees. If you want, you can check. Marginal costing is 60,000. whereas absorption costing is only 52,000. The difference between the two is 8,000 rupees. That is nothing but your fixed production overheads sitting inside your net stock. 6,000 minus 2,000. Net opening stock is there. Always stock is valued more under absorption costing. If the stock is on the debit side, the debit will be more, so profit will be less. If the stock is on the credit side, so credit is more, hence profit will be more. Are you guys clear with this? Right? So don't say more stock valuation means always absorption costing will be reporting more profit. No, it depends on where the profit is lying. If there is a net opening stock, right, the debit is more under absorption costing, hence your profit will reduce. If there's a net closing stock, so your credit will be more, again under absorption costing only, but this time since the credit is more, the profit will be higher. Are you guys clear with this? And look at Q4. What happens? Opening stock is how much? 2,000. Closing stock is how much? 0. So there is a net opening stock only. Once again under absorption costing. So always absorption costing value stock more. So 2,000 into 2. How much is it? 4,000 rupees is actually valued more on the debit side. So more debit means a lesser profit. Exactly what happens right now. Absorption costing will be reporting a lesser profit to the extent of 4,000 rupees. If you want, you check. 76,000 is the marginal costing profit. 72,000 is the absorption costing profit. The difference is what? 4,000 rupees, 2,000 into 2, net opening stock into, yeah, right, your fixed cost in sitting inside your net stocks. Clear with this, guys? Or in other words, we can come to a conclusion. When there is no stocks, or when opening stock is equal to closing stock, that is net stock is 0, right? The profit reported under absorption costing is equal to profit reported under marginal costing. Scenario number 1. When opening stock is more than the closing stock, or in other words, there is a net opening stock, right? So the debit side is more under absorption costing, hence the profit of absorption costing is less as compared to your profit under marginal costing. Clear with this? Which scenario is this? Scenario quarter 3 and quarter 4. There is a net opening stock. Clear with this, guys? So always in this case, see, marginal costing was reporting more profit, 60, 76. Here it was only 52 and 72. Clear with this, guys? Right? So when my opening is greater than closing stock, right, that is the net opening stock is there, absorption costing will report a lesser profit. When there is a net closing stock, or in other words, closing stock is greater than opening stock, in this case what happens? So obviously now the credit side is more, hence absorption costing will start reporting more profit as compared to marginal costing. This is quarter number 2. What happened here? So quarter number 2, I had a net closing stock, so here 6,000 into 12,000 rupees was more under absorption costing, 44 in marginal, but what happened? 56 in absorption. Are you guys clear with this? So a simple one-line summary here, you can say 4 scenarios when there is no opening stock or closing stock, or when opening stock is equal to closing stock, or when opening stock is greater than closing stock, or when opening stock is less than closing stock, or in other words, closing stock is more than opening stock. Clear with this, guys? When there is no opening or closing stock, right, marginal costing profit will be equal to absorption costing. Let us keep absorption costing as the base. Absorption costing profit will be equal to marginal costing profit. When opening is equal to closing, once again there is no net stocks here, absorption costing profit will be equal to marginal costing profit. Next, when opening stock is greater than closing stock, what happens in this case, guys? What happens in this case? So debit side is more under absorption cost. Always absorption costing will only have a more stock. If the net stock is on the debit side, profit will be less. If the net stock is on the credit side, profit will be more under absorption costing. Clear with this, guys? Here net stock is more on the debit side, hence absorption costing will be reporting a lesser profit than marginal costing, or you can say marginal costing reports more profit than absorption costing, right? When the opening stock is less than closing stock, or in other words, there is a net closing stock is more, in that case what happens? Absorption costing will report more profit than marginal costing. Are you clear with this, guys? And always remember, the difference in the profits reported under these two systems are exclusively on account of what? The fixed production overheads sitting inside your net stock. Are you guys clear with this? And that is the only reconciling item between the profits reported under marginal costing and absorption costing. And this question is a masterpiece question that covers all the situations that we saw here, right? The net, there is no the net opening stock is equal to closing stock, or opening stock is greater than closing stock, or opening stock is less than closing stock. All the scenarios in a single question, it gets covered. That was the reason why I wanted to cover this sum in the marathon itself. Clear with this, guys, right? And that's about the concept of marginal versus absorption costing. So I hope this completely recapitulated the entire concept, right? I think ideally, in a marathon itself, we are literally covering all the entire concepts here, right? Even for first timers, it could be useful, right? So please go and update your library of adjustments. Write down marginal costing versus absorption costing hyphen preparation of income statement under marginal costing and absorption costing for 4 quarters and reconciling the profits. So marginal costing versus absorption costing hyphen preparation of income statement under marginal costing and absorption costing for 4 quarters and reconciling the profits. Clear with this, guys, right? So with this we have completed all the concepts in marginal costing area, right? We have completed all the concepts in marginal costing area. The last segment of discussion is exclusively there for students doing paper 8 of CMA intermediate. That will be covered exclusively for them, right? With respect to others, with respect to your CA intermediate, right, this is all about it, as well as even for CMA inter paper 12, this is all about it. That's an accept or reject of special order, which is exclusively for CMA inter paper 8 students, right? Fine. So now let's move on to the next and the last segment of discussion, which is accept or reject a special order, right? Ideally, though it is specifically a concept covered, it's not a specific concept as such, it is a variant of a question. Though it is, I've mentioned that it is exclusively applicable for students doing CMA intermediate paper 8. Now, I feel this is also a question which you can expect at your CA intermediate level, right? So definitely this is something even CA inter students can also expect in their exams, because it is not a separate concept, it is more of an application driven area. So I would still say, I would rather still suggest students doing the CA intermediate to follow this with one particular numerical question from your CMA intermediate paper 8, right? Cost accounting. From that, I will take up one question. With the help of that, I will be doing this particular area. Once again, guys, let me tell you very, very clearly, this is not something that is, a specific concept as such, but this is one area which even CA inter students can expect in their exam. On that note, let's get started with one numerical problem from your CMA intermediate paper 8, right? Cost accounting solved question bank. So please take question number 12 of your paper 8 solved question bank. It's on page number 269. Now, look at this. The operating statement of a company is as follows. Now, what have they mentioned? Sales 80,000 units at the rate of 15. The sales value is given. Variable cost, material, labor, overheads. The total variable cost is given, right? Which means how much is the variable cost per unit? 7,20,000 divided by 80,000. 7,20,000 divided by 80,000. How much is that? The variable cost per unit is rupees 9. Correct? Overall variable cost per unit is how much? 7,20,000 total variable cost divided by the total units, right? Next one. How much is the fixed cost? It's given in the question as 3,20,000. The total cost is variable plus fixed. The profit is sales minus total cost they have given. Right, guys? So literally as of now, what you can make out is that how much is the sales? The selling price is going to be 15. Variable cost is going to be 9. So currently the contribution per unit is going to be how much? 6 rupees, right? That's what it is. The profit of 1,60,000, how did they arrive? 6 into 80,000. So 80,000 into 6. 4,80,000 is a contribution. From that, subtract 3,20,000 of your fixed cost. You will arrive at 1,60,000. Marginal costing income statement you can prepare. Next. The capacity of the plant is 1 lakh units. Overall, I have a capacity of 1 lakh, out of which currently I'm selling how many units? 80,000 units, which means 20,000 units I have an idle capacity. Sorry, 20,000 units I have an idle capacity. Next one. A customer from USA is desirous of buying 20,000 units at a net price of 10 rupees per unit. Now, a foreign customer, special order, he says, look, I am willing to buy 20,000 units from you, but max, the selling price which I will pay you is only 10 rupees. Advise the producer whether or not the offer should be accepted. We need to decide whether this offer should be accepted or not. And will your advice be different if the customer is a local one? This is actually a theory question. What it is, I will tell you. Now, you guys tell me, advise whether or not the offer should be accepted. Very simple. Logically, you think, I have a capacity to produce 1 lakh units. Currently, I'm producing 80,000 units, which means the extent of 20,000 units, I have an idle capacity. One guy is coming to me, US client, he's customer, he's saying, I'm willing to pay 10 rupees for every unit. Now, you guys tell me, to produce every unit, what is the variable cost you incur? 9 rupees, correct? Now, on this extra 20,000 units, each unit, right, you are going to earn how much? He says, he will pay you 10 rupees, right? And variable cost is how much? 9. So literally for every additional unit that you are selling, this 20,000 units, you'll be able to generate 1 rupee of contribution, right? So 1 into 20,000 units. So literally extra you'll be getting 20,000 rupees of contribution that will overall build your profit. Are you guys clear with this, right? That's all it is, no, right? So clearly, can you accept the offer? Yes. Why? Because as long as for this extra units, I am able to recover my variable cost. The selling price is more than the variable cost. So on each of these extra 20,000 units, I'm getting a positive contribution. So whatever I get extra is going to build my profit, guys, because for this extra 20,000 units, no specific fixed cost is incurred. Already this fixed cost, 3,20,000 units, right, is being recovered by the existing 80,000 units, and I'm already reporting a profit of 1,60,000. Right, the extra 20,000 units I'm going to sell. Each unit selling price is 10, variable cost is 9, contribution is 1. So 1 into 20,000 units is going to give me 20,000 rupees of extra profit. Guys, clear with this, guys, right? So literally speaking, extra profit that you're going to get, the profit will be increased by 20,000 by accepting the order. Hence, it is advised to accept the same. Clear with this, guys? Now, what they have done, simple. They have prepared the entire marginal costing under 80,000 units. Now, for this extra 20,000 units, what will be the sales? So 20,000 into 10, 2 lakh, minus all the variable costs. So 20,000 into 9, if you get, overall variable cost is how much? 1,80,000. So 2 lakh minus 1,80,000 gives you a contribution of how much for this incremental, for this extra 20,000 units? 20,000. No specific fixed cost is incurred for this. So literally your profit will be increased by 20,000. So what they have done, 80,000 units, they have prepared an income statement, marginal costing income statement. For this extra 20,000 units, they have prepared the marginal costing income statement, 80,000 plus 20,000. Overall for 1 lakh units, they have prepared the marginal costing income statement. But in my opinion, directly you can say no, right? So on this extra 20,000 units, I'll be able to generate a contribution, incremental contribution of 20,000 rupees, right? Clearly you can accept the order because your overall profit will increase by another 20,000. So from 1,60,000, add another 20, the new profit becomes 1,80,000. This way also you can answer and you will say, yes, as the profit increases by 20,000 rupees, you can please go ahead and accept the order. Clear with this, guys? Now, will your answer change if the customer is a local one? Yes. Now, this is not from a costing perspective. This is from a non-cost perspective. Now, generally, I sell it locally. 80,000 units I'm selling. Local sales price is how much? 15. For one customer alone, if I sell it at 10 rupees per unit, obviously the remaining people in the market, they will not be, silent. They will come and ask. For one guy alone, you are giving discount. Why can't you give discount to me also, right? It will create tension and rift in the local market. Since this guy is an outsider, right, an export order or an international customer, whatever sale price I fix for him, right, generally is not known to the local market. Suppose in the local market, if I'm making this distinction, right, it will create a problem in my business. So ideally, if you are, if this customer is a local customer, no, do not encourage that. It's basically a theoretical one. If the order is from local one, it should not be accepted because it will adversely affect the present market. This is what they are saying. It is from a theoretical perspective. Are you guys clear with this? That's all this question is all about. Clear with this, guys? Now you tell me, is there any specific concept here? No, this is just one variant of testing a particular question in marginal costing. That's why I said even CA intermediate students can just have a look at this kind of question. You can watch out for these kind of questions in your exam, right, guys? So with this, you can just go and update your library of adjustment. Write down accept or reject a special order. Please write down accept or reject a special order. Fine, guys, right? So with this we have also completed the last part, though I mentioned it is only for CMA intermediate paper 8 students, but still, in my opinion, other CA inter students can also definitely watch out for this area because it is a common sense driven area. Clear with this, guys? So with this, we have literally covered this entire chapter of marginal costing. In fact, though it was marathon, we actually solved about 5 or 6 exact questions we solved, right? In the marathon itself, we solved the 2 comprehensive questions touching about every single concept covered in this particular chapter, right? It's more than a marathon ideally, in my opinion, because every single thing we have derived it based on concepts and other things. But during our regular lectures and all, right, during our regular or the exam oriented batch, we cover a lot of numerical problems, some 30-40 numerical problems depending on, right, the respective courses, CA, CMA and all, whatever is that we do in detail. Since this being a marathon, here also I didn't condense on the concepts. Every concept was actually revised. Every single concept we did, along with a few numerical problems, which in my opinion were very important for revision. With this, we have comprehensively covered this particular chapter called as marginal costing, right? On that note, let's move on to the next chapter. So now let's get started with the revision of yet another important chapter called standard costing, right? So now, before we get started, so first of all, guys, I want to tell you something very important. This chapter is once again a common chapter both in your CA intermediate and in your CMA intermediate, right? In CA inter paper 4 cost and management accounting, and in your CMA intermediate, this chapter is there in paper 8 cost accounting as well as in paper 12 management accounting, right? Now, what is there in each of the respective courses? Clearly, I will be talking about that in a few minutes from now. But before that, first I want to make one thing once again very, very clear. This marathon is a common marathon. For this particular chapter, the marathon is common for both CA and CMA intermediate students. However, all our courses, right, be it regular or your exam oriented batch and all that, are exclusively recorded separately for CA intermediate, and even in CMA intermediate, paper 8 recordings are separate, paper 12 recordings are separate, and all the books that we use, right, be it your concept decoder as well as your solved question bank, are completely different, right? The recordings are all separately done, right? However, for the purpose of marathon, since the concepts covered are the same, right, so I'm going to revise it in a common lecture. Clear with this, guys? On that note, let's get started with this beautiful chapter called as standard costing. Now, guys, this particular chapter, standard costing, goes on to achieve the objective of control. Now, we all know that our subject, cost and management accounting, right, it has 3 objectives: stock valuation, profit computation, decision making, and the third objective is control. And each of the chapters in our subject goes on to achieve, right, either 1 or maybe 2 or maybe all the 3 objectives. In this chapter, right, it goes on to achieve the objective of control, right? Sir, How does it help achieve the objective of control, right? What is this chapter standard costing about and all that, right? Quickly, we will just brush it up here. Now guys, now what happens? Every company before the start of the year or before the start of the period, they prepare a budget. And once the budget gets prepared, the employees of the organization are clearly assigned their respective duties and they are made to perform the task, right? And at the end of the period, the targets, right, are compared with the actuals and they analyze the differences between what they were supposed to do and what they have actually done. And once they analyze the difference, obviously certain differences could be favorable for the company, right? Or maybe in certain places the employees would be efficient, in certain areas they might be inefficient. So accordingly, they will reward the employees or punish them. Reward in case they are efficient or punish in case they are not efficient. Punishment could be a salary cut or maybe a cut in the bonus, or as the case may be dismissal, or maybe even a suspension, or as the case may be. So clearly guys, control involves 4 steps in this particular chapter. Number 1, the company establish standards or targets. Number 2, these targets are evaluated, right? They are compared with the actual performance and they analyze the variance. Variance means the difference between your target and actual. And finally, they are rewarded or the company takes corrective actions in case they are not able to meet the targets. This is how control is being established by standard costing. How and all these things in a few minutes from now, we will start with this chapter in detail, and that's when you will be able to have a crystal clear clarity. Now guys, always remember, at the beginning of every period, the company prepares a budget. They will say budgeted sales is so much. These are all the budgeted cost I'm planning to incur. So sales minus cost, they will arrive at the budgeted profit. Now at the end of the period, now all the actual performance is done and actual sales minus all your actual costs gives you your actual profit, right? Now the budgeted profit and the actual profit will not be the same most of the cases, right? Now there will be a difference between my budgeted profit and my actual profit, right? This difference is called as profit variance, the variance between my budgeted profit and my actual profit, right? Now guys, now sir, this variance, is it good or bad? It depends. For example, if my budgeted profit, I wanted to earn a profit of 80 crores, whereas my actual profit was 100 crores, I will say there is a 20 crore rupees of variance. Yes, but is this variance good or bad? Sir, you wanted to earn a profit of 80, but you've actually earned a profit of 100. So this is a very good variance for me. So I will call this as 20 crore favorable variance. So I will say the variance is 20. Within bracket, I will put this F. This F stands for a favorable variance. Suppose I plan to have a profit of 80 crores. The budgeted profit was 80, but the actual profit was only 60. In this case, once again, there is a variance of 20, but this variance of 20 is actually not a good variance. I want to earn more, but I've actually earned only less. So we call this as adverse variance. Clear with this, guys? So in exam, if you just mention the variance alone, it is not, it is not relevant. This variance should be suffixed, right? After this number, you should always write whether it is a favorable variance F or an adverse variance A. Now, please don't think some students mug up. Sir, if it is positive, it's a favorable variance. If it's negative, it's an adverse variance. Absolutely not. Simple. The variance which has the impact of increasing your profit is always a favorable variance. A variance which has an impact of reducing your profit is an adverse variance. Here, profit we're talking about 80 crores I planned, I have actually earned 100, right? So obviously here it is a favorable variance. Here I plan to earn 80, but I've actually earned only 60. It has an impact of reducing my profit, hence I call it as an adverse variance. Clear with this, guys? Now, sir, profit variance, I say, for example, 20 crores adverse. Now, if I go to my managing director and tell him, sir, the profit variance is 20 crore. Now the next question he'll ask me is, who is responsible for that? Why did I have a 20 crore rupees of adverse variance? Now, the variance in profit can broadly happen because of two reasons. One is variance happening on the sales side. And number two, the variance is happening on the cost side. Once again, the variances happening on the cost side can be further bifurcated into material related variance, labor cost related variances, variable overhead related variances, and fixed overhead variances. Clear with this, guys? So the variance in profit is nothing but sales minus cost. So, sir, the variance in profit can happen because of variances happening on the sales side and variances happening on the cost side. So sales related variances and cost related variance. Further, sir, cost, what are the costs I have? Material, labor, variable overhead, and fixed overhead variances. So literally what we do in this entire chapter, we find out the reason for the variance in my profit, that is budgeted profit and actual profit. We split it out and find out how much is my sales related variance and how much is my cost variance. Cost variance is further bifurcated into material, labor, variable overhead, and fixed overhead variances. Clear with this, guys? So this is the overall objective and big picture of this chapter, and once we find out all these variances, we now know the actual reason why actually the profit has been varied, why there is a difference in between my budgeted profit and actual profit. With this, even a reconciliation statement can be prepared. Are you guys clear with this? Overall, this is the big picture of this chapter. Now guys, sir, what is applicable for my exam? For CA intermediate students, you have all the cost variances, material variances, labor variances, variable overhead variances, fixed overhead variance. CA intermediate, in your syllabus you have only these 4 variances. That's about it. With respect to CMA intermediate students, 2 papers are there. Paper 8 cost accounting, paper 12 management accounting. Paper 8 cost accounting, you have only material variances and labor variances. That's all you have, right? And with respect to paper 12 students, right, management accounting, literally guys, this entire chapter is applicable for you, right? You have all the 4 cost side variances, plus you also have your sales side variances. Literally this chapter is very, very extensive for CMA intermediate paper 12 students, group 2 students of CMA intermediate. Clear with this, guys? So this is how your syllabus has been bifurcated. But trust me guys, every single thing, concept are all one and the same, right? And once again, I'm telling you, this marathon is a common marathon for everybody, CA and CMA inter students. However, right, our course recordings are completely different. All our paid batches, be it your regular or exam oriented, are exclusively recorded for CA inter, CMA intermediate paper 8 and CMA intermediate paper 12. Even in CMA intermediate, between the 2 papers, we don't have a common recording, exclusively done. The books are all separate. Clear with this, guys, right? Since it's a common topic that is done here, for the purpose of marathon alone, I'm doing it in a common manner. Right, guys? So on that note, let's get started with this particular chapter. Right, guys? Fine. Now, before we enter into this particular chapter, once again, let's quickly recapitulate what is the meaning of standard cost. Right? So I will recapitulate the meaning of standard cost with a small example. Right? Understanding the concept of standard cost. This is very important to set the context. Now guys, let us say I plan to incur a cost of 1 lakh rupees, right? Budgeted cost was 1 lakh, but actually I ended up spending, let us say, rupees 96,000. Now you guys tell me, how much is the variance, and if so, that variance, is it favorable or adverse? Sir, you could have incurred 1 lakh. You have actually incurred only 96,000. Sir, 4,000 rupees you have incurred less, sir. So it is 4,000 favorable variance for us, right? This is what you might think. Now, let me add one more data here. Let us say this 1 lakh rupees you are allowed to incur for a budgeted output of 10,000 units, right? So I thought you are allowed to incur 1 lakh rupees if you are producing 10,000 units. You've actually incurred 96,000 rupees for producing 8,000 units. Now you guys tell me. First question. Now, can this 1 lakh be directly compared with 96,000? The answer is absolutely not. Why? Because this 1 lakh is pertaining to a completely different output and 96,000 is completely pertaining to a different output, right? Actually, I have incurred a cost of 96,000 for producing 8,000 units, right? Now, this 96,000 cannot be compared with a cost pertaining to a completely different output level, right? Now, sir, how will we be then able to compute the variance, sir? Now, what I will do, based on the budget, I can understand, sir, you are allowed to incur 1 lakh rupees to produce how many units? 10,000 units, which means per unit, how much is the cost you are allowed to incur? 1 lakh divided by 10,000, it's going to be rupees 10 per unit. Clear with this, guys, right? Now, actually, how many units you have produced? Sir, you have actually produced 8,000. So, for the 8,000 units which you have actually produced, right, what is the cost you should have incurred? So, for each of these 8,000 units, you were supposed to incur 10 rupees. So, overall, you should have incurred 80,000. Right? However, you have actually incurred how much? 96,000 rupees. Now this 80,000 can be compared with the 96,000. Why? This 80,000 is the cost which you are supposed to incur for the actual output, whereas this 96,000 is the cost you have actually incurred for the actual output. Here, the two outputs are the same. So, for the actual output, what is the cost you should have incurred should only be compared with the cost which you have actually incurred for the actual output. Clear with this, guys? So, here, this 80,000 is what we call as standard cost. Clear with this? Are you all able to understand this? Yes. So now basically, guys, standard cost, always remember, means the cost which you are allowed to incur for the actual output. So for the actual output, what is the cost you are allowed to incur is called as standard cost. Or in other words, now if you notice here, this 8,000 units is nothing but actual output, right? And this 10 rupees is nothing but standard cost per unit, right? Where did I get this 10 rupees? Using the budget data. So this budget was pertaining, 1 lakh was pertaining to a total of 10,000 units, but using the budget data, I could unitize and understand per unit what is the cost I am allowed to incur. Ideally, this is nothing but budgeted cost per unit, but when we unitize, we don't call it as budgeted cost per unit. When we are unitizing, we call it as standard cost per unit. So standard cost per unit was how much? 10 rupees. So now for the actual output, what is the cost you are allowed to incur? 10 rupees. So now here I will say that, look, you were supposed to incur 80,000, but what has happened? You have actually incurred 96,000. In this case, there is a variance of how much? 16,000 rupees. That too adverse. You have incurred 16,000 rupees more. So don't compare 1 lakh directly with the 96,000 and say 4,000 you have saved. No. For the actual output, you are only allowed to incur 80, but you actually end up incurring 96,000. This is a fundamental understanding before we enter into the standard costing area, because this is a very, very important chapter, as well as you need to have all this background concepts before we get into this particular area. Clear with this, guys? Perfect. Now understand one more thing. The concept of standard means what? For the actual output, what is the cost allowed, right? Or in other words, we can say budgeted cost, this 1 lakh rupees is nothing but the cost planned, whereas actual 96,000 we can say is the cost incurred, and the standard 80,000 is the cost allowed. Are you clear with this? There has to be a clear-cut distinction between understanding the concept of budget, standard, and actual. Clear with this, guys? And always standard only gets compared with actual, and that is the reason why the name of the chapter is standard costing, not budgeted costing. Clear with this, guys? Perfect. Now I want you all to understand one more thing. The concept of standard is not only applicable on cost, right? For example, you can even apply the concept of standard on your labor hours. For example, now you were allowed to let us say take a total of 1 lakh labor hours to produce 10,000 units, which means per unit you are allowed to take 10 labor hours, right? But actually I have taken 96,000 hours to produce 8,000 units, right? Which means what is the standard labor hours, means what is the labor hours you are allowed to take. Actually 8,000 units into every unit you are allowed to take 10 hours. Overall you could have taken 80,000 hours, but actually I have taken how many hours? 96,000 hours, which means 16,000 hours I have actually taken more. So, or in other words, the concept of standard can be applied on cost, the concept of standard can be applied on labor hours, the concept of standard can be applied on kgs of raw material consumed, on anything. Clear with this, guys? Basically, what do you mean by standard? For the actual output, how much of cost is allowed, or how much of labor hours is allowed, or how much of kgs you are allowed to consume, and so on. Clear with this, guys? So basically understand one thing, the concept of standard always keeps the actual output as the base to do all the computations. Clear with this, guys? So with this backdrop, let's get started with the first cost variance called as material cost variances. Clear with this, guys? So first we will get started with material cost variances. Right now, this material cost variance, right, is applicable for, of course, CA intermediate students as well as CMA intermediate paper 8 as well as paper 12 students. So I told you in CA intermediate all the 4 cost variances, material, labor, variable overhead, fixed overhead variances are there. CMA intermediate, only in paper 8 we have only the first 2 variances, material and labor variances, and in paper 12 all the 4 cost variances plus the sales variance, entire chapter is there. Clear with this, guys? Have this in your mind, and with that we will get started. Now guys, material cost variance, right, so is the formula for calculating material cost variance is standard quantity into standard price minus actual quantity into actual price. It is bifurcated into 2: material price variance, material usage variance. Material price variance, the formula is standard price minus actual price into actual quantity. Material usage variance is standard quantity minus actual quantity into standard price. Now this usage variance can be further classified into 2: material mix variance and material yield variance. Material mix variance, the formula is revised actual quantity minus actual quantity into standard price, and material yield variance, the formula is standard quantity minus revised actual quantity into standard price, or actual yield minus standard yield into standard cost per unit, or standard loss minus actual loss into standard cost per unit. Sir, so many formulas are there, sir. How do we actually remember? Trust me, guys, you need not even mug up a single formula. Quickly, I will recapitulate every single thing that we are going to do here. Not even a single thing needs to be mugged up. Now, let me take an example. Let us say, guys, my actual output, I actually produced 100 units. Right now, to produce 100 units, let us say, for example, let me tell you, to produce 1 unit, you are allowed to consume 1 kg of raw material, which means to produce 100 units, how many kgs of raw material you are allowed to consume? Sir, 100 into 1, so 100 kgs of raw material I am allowed to consume. Yes, every kg of raw material you should have purchased at a price of 10 rupees per kg. So I call this as standard price. Means what? The price at which I should purchase every kg of raw material. But however, if you see, actually I was able to achieve this output of 100 units by consuming only 90 kgs of raw material. So the actual quantity consumed was how much? 90 kgs only. Clear with this, guys? And every kg that I actually consumed, right, I purchased it by paying an actual price of how much? 12 rupees per kg. Clear with this, guys? So basically you only need 4 data here: standard quantity, right, standard price, that is the kg of raw material you are supposed to consume, and every kg you are supposed to pay 10 rupees. Actual quantity, you consume 90 kgs and every kg you have actually incurred a cost of 12 rupees. So now material cost variance is what? Standard material cost, the material cost you are allowed to incur minus the actual material cost, the material cost you have actually incurred. What is the formula? Material cost you are supposed to incur is what? Standard quantity into standard price. You are supposed to incur, or you are supposed to consume 100 kgs, each kg at a cost of 10 rupees. So 100 into 10, that is nothing but standard quantity into standard price, literally 100 into 10. The total material cost should have been how much? 1000 rupees. Whereas actual material cost was how much, sir? Actual quantity, I actually consumed 90 kg, each kg I paid 12 rupees. So actual quantity into actual price, that's what is being mentioned here. So 90 into 12, so how much does that come out to? 1080 is the actual material cost which we have incurred. Or in other words, guys, you were supposed to incur a material cost of 1000 rupees, but you have actually ended up incurring a material cost of 1080 rupees. So 80 rupees you have incurred more than what you are supposed to incur, right? So I call the material cost variance as 80 rupees adverse. Clear with this, guys? Of course, because if my actual cost is more than the standard cost, so it will actually reduce my profit. Correct? No, right? It has an impact of reducing my profit. I call it as an adverse variance. Are you guys clear with this? Now, this is why I said don't mug up. Some people, what they do, sir, 1000 minus 1080, which means it is negative, sir. Negative figure, which means I need to definitely go, and negative means adverse. Please don't mug it up like this, right? So here, logically think, actual cost is more than standard cost, which means it has an impact of reducing my profit. Hence, I call that as an adverse variance. Now, I go and tell my managing director, sir, material cost variance is 80 rupees adverse. Now he will ask me, who is responsible for this? Now, guys, if you notice, material cost comprises of two components. One is the quantity, the other one is the price, the rate, or the price at which I purchase every kg. Guys, correct? That is the reason why material cost variance is split into two. One is called as material price variance, the other one is called as material usage variance. Now, material price variance, right? Who is responsible for the pricing of this particular raw material, right? Now, actually, in a factory, the purchase manager is only responsible for the price, right? Now, every kg, right, he was supposed to purchase by paying 10 rupees to the supplier. He had to negotiate and make sure that he purchases every kg at 10 rupees only. It is his responsibility. However, due to his inefficiency, what he has done, he has ended up negotiating a deal by paying 12 rupees for every kg of raw material purchase. Clear with this, guys? So this particular purchase manager is responsible for the price, right? So here what I do, he is responsible for what? Price. Hence within the bracket I say standard price minus actual price, right? You are supposed to incur only 10, but you have incurred how much? 12 rupees. Clear with this, guys? Into, I multiply this with actual quantity. Sir, why is it actual quantity? If you notice, purchase manager is responsible only for the price decision. Quantity he will not decide. Whatever quantity the production manager asks the purchase manager to purchase, all those quantity he needs to purchase, and on every quantity that he has purchased, right, he is only responsible for the price. Clear with this, guys? Now my production manager asked me to purchase how much? 90 kgs, because he's consuming only 90 kgs. On each of these 90 kgs, this purchase manager is responsible for the pricing decision. Are you clear with this? Hence, the material price variance will be what? Your standard price minus actual price into actual quantity. That is, the purchase manager is dependent on the production manager for the quantity decision. Hence, I multiply this with actual quantity. So 90 kgs, sir, I purchased. On each of these 90 kgs, I ended up paying 2 rupees more. So 90 into 2, 180 rupees is the extra cost I have incurred. Hence, it is an adverse variance. As simple as that. Nothing needs to be mugged up. Clear with this, guys? Next one. On the other side, what do we have? Material usage variance. Usage means consumption. Who is responsible for the usage? Production manager is responsible for the usage. Now, this production manager, he's responsible for what? He's responsible for the quantity right? So within bracket, standard quantity minus actual quantity will come. You should have consumed 100 kgs, but you consumed only how much? 90 kgs. So 100 minus 90, so you have consumed 10 kgs less. Now I cannot leave it in kgs. I need to give it a monetary value into standard price. Sir, why sir here alone standard price? You are not taking the actual price. Remember, the purchase manager, this guy was dependent on the production manager for the quantity decision. Whereas this production manager is not dependent on the purchase manager for anything. There is a one-way traffic only. Purchase manager is dependent on production manager. Our guy, production manager, he is not dependent on purchase manager for anything, right? Suppose if I take actual price here, then the efficiency or inefficiency of the purchase manager will be passed on to my production manager, right? So I don't want to do that. I want to clearly identify which manager is responsible to the extent of how much to the variance. Clear with this, guys? Hence, I don't take actual price. I only take standard price here because our guy, production manager, is not dependent on whom? The purchase manager. Clear with this, guys? So he's responsible for what? Quantity. So within bracket, standard quantity minus actual quantity into standard price, because our guy is not production manager is not dependent on the purchase manager for anything. Clear with this, guys? So 100 minus 90 into 10. So 10 kgs you have consumed less into 10. It's going to be 100 favorable. Good for the company. Now if you notice, ideally speaking, because of the purchase manager, I have lost 180 rupees. And because of the production manager, I have actually gained 100 rupees. Net of the net extra loss for me is only 80 rupees. So if I just report this 80 rupees, there is absolutely no meaning by itself. Are you guys clear with this? So now what we actually do is that we bifurcate this into price and usage variant and clearly identify who is responsible to what extent and how much do they contribute to the overall variance of the company. Are you guys clear with this? So here, this purchase manager has been super inefficient, right? So I will clearly take a corrective action here. I will never give him a bonus, or I will ask him for a pay cut. Whereas the production manager has been super efficient. Here, what will I do here? So to him, I will say, very good, you have done a very good job. Maybe I will incentivize him by giving a bonus and all these things. This way, overall, it helps in achieving the control. Clear with this, guys? Are you all able to understand? And that's about it. And that's about this area. So now, your material cost variance. What is the formula? Standard quantity. Look at this. Standard quantity into standard price minus actual quantity into actual price, bifurcated into two: material price variance and material usage variance. Material price variance, halt. Whose responsibility? Purchase manager. So standard price minus actual price into what? Actual quantity. Why? Because I'm responsible for the pricing on every quantity that I purchase. Quantity is not in my control, so the quantity is something which the production manager asks me to purchase. Are you guys clear with this? Right? Now, how about the other guy, material usage variance? Whose responsibility? Production manager. So standard quantity minus actual quantity into standard price. Why not actuals? Because if I take the actual, I will be passing on the efficiency or inefficiency of the purchase manager to the production manager, while ideally the production manager is not dependent on him for anything. Are you guys clear with this? Logically, if you just remember all these things, there is no way you will find this chapter difficult. It's that simple. Clear with this, guys? Now, suppose a company uses more than one type of raw material. If a company uses more than one type of raw material to produce an output, then your usage variance is further classified into two: material mix variance and material yield variance. Clear with this, guys? So if a particular company is actually using more than one type of raw material, right, to produce every unit of output, then the usage variance is bifurcated into mix and yield variance. Right? Now the formula for material mix variance is revised actual quantity minus actual quantity into standard price, and the formula for yield variance is ideally the balancing figure: standard quantity minus revised actual quantity into standard price, or there are two other formulas prescribed here. Now what is this, sir? Do not worry. This too alone, with the help of a numerical problem, of actual example, an actual exam question I will take, and based on that we will be cracking this also. Clear with this, guys, right? That is actually a strategy to crack all these areas. And the best part is, once you finish material cost variance, automatically labor cost variances, even variable overhead cost variances are very, very similar, and it will also be done together. As simple as that. Clear with this, guys? That's why I'm spending a little more time here so that we complete it smoothly. And in fact, guys, we are going to do some numerical problems as well. So I'm going to give an exhaustive coverage in the marathon itself so that you guys get a very good comfort in this particular chapter. Right, guys? So now I'm going to pick one question from your CA intermediate from your CA intermediate solved question bank. Now, guys, as I told you, there are separate question banks, separate materials we have for CA intermediate, CMA intermediate paper 8 we have a separate book, CMA intermediate paper 12 also we have a separate book. But this particular question, I'm going to take it from CA intermediate, right? CA intermediate solved question bank. It's in volume number 2. Right, so I'm going to take this from volume number 2. I'm handpicking a few sums, and that alone I'm covering in the marathon, because in marathon, it is meant for revision purposes, right? When we are learning from the scratch, obviously every single sum we do in all our courses and all, in a marathon we are revising it. Still, for the benefit of all students, I'm setting the background concepts, and I'm handpicking a few sums and doing it in the marathon also, right? I'm doing it only for the benefit of students, but don't worry, in all our courses we do the entire chapter fully. Clear with this, guys? So now let's get started here. So please take question number 2, right? It's on page number 464. This is CA Inter solved question bank. This question is very much applicable for CMA intermediate, both paper 8 and paper 12 also, right? So this is a revision we are doing, so that is the reason why I'm doing it in a common manner. Fine, guys. So now let's get started here. Now, the standard cost of a chemical mixture is as follows. So, one second, I will just take this question separately. Okay, one second. Yeah. Okay, guys. Fine. The standard cost of a chemical mixture is as follows. 40% of the material should come from A at the rate of 20 rupees per kg. 60% of material B, that is 60% of the total input, should come from material B, and every unit of B, every kg of B should be purchased by paying 30 rupees. This is the standard price. The standard loss is 10% of the total input. It is expected in production. Now, the cost records for a period showed the following usage, which means what? Actual data is given. 90 kgs of material A was consumed by paying 18 rupees per kg, and 110 kgs of material B was actually consumed by actually paying 34 rupees per kg. The quantity produced was 182 of kgs of good product, which means the actual output was how much? 182 kgs. Right? Now, this is what they have given. Now, based on this, we need to compute all the material variances. Now, guys, this company is using more than one type of raw material to produce their output. In this case, what happens? You have material cost variance bifurcated into material price and material usage. Further, material usage variance is bifurcated into material mix and material yield variance, right? Before that, first, guys, we need 4 figures. What are the 4 figures? Standard quantity, standard price, actual quantity, actual price. We need it, right? Now, how can we go about with this? First thing you need to know, sir, actual quantity, actual price and all are available, sir. Actual quantity, material A 90, material B is 110 kg. Actual price 18 for A, 34 for B. All these things I have, sir. Even standard data, standard price I have, A 20 rupees, B 30 rupees. Standard quantity is where many students generally struggle. Simple, guys, simple. Let me just take this up here and put it forward for you. So it's question number 2, your CA intermediate question bank. Now, how do we go about with this? First, what have they given? Raw material A, raw material B, total input. if you look at it, raw material A, basically guys, what they are saying, say if your total input was 100 kgs, 40% should come from material A. Please have the book with you. You can download the book from our website. Please have the book with you, right? So 40 kgs will come from A. And how about B? 60%, 60 kgs will come from B. Clear, guys? Now they are saying out of this total input, a standard loss of 10% is expected. So a standard loss of 10% on the total input means what? 10% on 100 is 10 kgs of loss is expected, which means effectively you will get an output of how much? 90 kgs. Clear with this, guys? So, or in other words, can I say, if I input 40 kgs of A and 60 kgs of B, effectively only then I will be getting 90 kgs of total output. Guys, correct? This is the meaning. Now, based on this, can we compute the standard quantity data? Yes. Now, standard quantity means what? For the actual output, how many kgs of A and how many kgs of B I should have inputted. This is the meaning. Now, if you look at it, what is the actual quantity produced? 182. Now, keep that as the base, 182 kgs. Now, reverse work, simple. If I input 40 kgs, I need 40 kgs of A to get an effective output of how much? 90 kgs. So, to get an effective output of 182 kgs, how many kgs of A will I be needing? Simple, no? You can just reverse work and calculate. Guys, clear with this? So, 40 is for 90. How much is it for 182? So 40 by 90 into 182. If you do this, you effectively get 80.888888. Right? So I'm putting it here. It's going to be the calculation. 40 is for 90. So 40 is for 90. How much is it for 182? Clear with this, guys? So literally we will say the standard quantity of A that I should be inputting is 80.888888 kgs, right? Don't round off the decimals. Please retain it fully in your calculator. Next one. Similar calculation for B. If I input, I need 60 kgs of B for an effective output of 90 kgs. For an effective output of 182 kgs, how many kgs of B I should have inputted? Simple, similar calculation. So you can just say, sir, it's going to be 60 is for 90. How much is it going to be for 182? So 60 by 90 into 182. How much you get? You get 121.333333. Right? It's going to be 121.333333. Clear with this, guys? You can add it up, or you can also say simple. Overall input will be how much? I need to input 100 kgs to effectively get 90 kgs. For an effective output of 182, what should have been my total input? 100 by 90 into 182. You can say that you will get 202.22222, or in other words, you can add these two, you will get that. As simple as that. Clear with this, guys? It's going to be what? 202.22222 kgs is the total number of the input, the total quantity of input that I will be needing. Guys, are you all able to understand this? So now literally what has happened here, I should have inputted 202.2222 kgs, right, to effectively get an output of how much? 182 kgs, which means the balancing figure, the difference between these two is going to be what? My standard loss. Are you guys able to understand? So how much is going to be my standard loss? The difference between the two. So 202.222, or in other words, you can also say 10 is the standard loss allowed for 90 kgs. How much is it going to be for 182? So 10 by 90 into 182, you will get 20.222, or in other words, 202.22 is the input allowed to get an effective output of 182. So the standard loss allowed is going to be how much? So it's going to be 20.2222 kgs. Are you guys clear with this? Right? So literally this is how your standard quantity column will look like. Guys, are you all able to understand? Now this is exactly what I have already done here itself. This calculation. This is how I have done this standard quantity. 80.888888 kgs is the kgs of A that you should have inputted. Kgs of B you should have inputted is 121.33333. You can see all the calculations. The back working is all given here. Just now we have done it. Clear with this, guys, right? The total input that was supposed to be done less loss, standard loss, you arrive at the effective output. Ideally speaking, this has to be 20.22222. Clear with this, guys, right? Now what is the standard price? Now we know it's given in the question. Every kg of A should be purchased at 20 and B at 30. So you can put it up here, 20 and 30. And how about the actual quantity? So actual quantity, 90 kgs of A. This is the actual, right? 110 kgs of B. Overall, what was the actual input? I have actually inputted how much? 200 kgs. Effectively, I got an output of how much? 182. By inputting 200, I actually got how much? 182 kgs, which means the actual loss was how much? 18 kgs. This is nothing but the actual loss. Clear with this, guys? What was the actual price here? The price was for A, 18 rupees per kg. B was purchased by paying 34 rupees per kg. Clear with this, guys? All these things are available. So now what you need to do, standard quantity into standard price, you'll get the amount column. So 80.888888 into 20. So 80.888888 retain full decimals into 20. Effectively you get 1167.7777. Then 121.333333 into 30. If you do, you get what? 3639.999. that can be rounded off to 3640. If you add the two, you get how much? 9257, 5257.777, right? Ideally speaking, this is the total cost of material which you were supposed to incur to get an effective output of 182. Ideally speaking, the standard quantity into standard price, the total raw material cost allowed to be incurred is going to be 5257.777. But what is the actual cost? 90 into 18. How much is that? 1620. 110 into 34. How much is that? It's going to be 3740. If you add up the two, you get 5360. So the actual cost incurred was 5360 for the actual output of 182. So literally first the material cost variance, standard quantity into standard price minus actual quantity into actual price. Clearly you can say this is the cost you are supposed to incur, whereas this is the cost you have actually incurred. Or you can do product wise, standard quantity into standard price minus actual quantity into actual price. You can do it. That's what we have totaled it up and we have arrived at here. So it's 5257.7777 minus 5360. You actually get 102.2222 adverse, right? So 102.2222 adverse is actually going to be my total material cost variance. Are you guys clear with this? So this is the cost I should have incurred, 5257.7, but I have actually incurred more, right? So 5360, hence clearly there is an adverse variance. Are you guys clear with this? The most important thing with respect to standard quantity, and the beautiful area is that standard quantity starts from the actual output. Reverse working you need to do. Sir, for the actual output of 182 kgs, what is the cost? I mean, how many kgs of A, how many kgs of B I was supposed to consume? This working you need to do. Only if you do this, you will arrive at the proper standard quantity. Every other data is available. We just need 4 ingredients: standard quantity, standard price, actual quantity, actual price, right? Actual quantity, actual price was available. Even standard price was available. Only standard quantity was required. And if you do it this organically, that's all is required. That's the reason why I started off even this revision marathon with the concept of understanding your standard cost and all. This is the reason behind that. Clear with this, guys? So the first thing that we have done is what? The first thing we have done is arrived at the material cost variance. Next one, what should we do? Material price variance. Now, what is the formula for material price variance? Simple. Material price variance is going to be, first, who is the responsible person? Your purchase manager. So we will say standard price minus actual price into actual quantity. Correct? This is going to be my material price variance. Right? Now what we need to do, raw material wise, we need to compute. Simple. Clear with this, guys? The logic and everything we have seen here, right? So now we just need to do this raw material, I mean your every single raw material wise. So first, for material A, how much is the standard price? 20. How much is the actual price? 18 into how much the actual quantity? 1620. So 20 minus 18 right, into actual, I'm sorry, actual quantity was 90. So 1620 is actual quantity to actual price, sorry. So 20 minus 18 into 90 kgs. So each of the 90 kgs I have purchased by paying 2 rupees less. So obviously it's a favorable variance. So 180 favorable. This is for raw material A. How about raw material B? Standard price minus actual price into actual quantity. You were supposed to incur 30, you have ended up incurring 34. 4 rupees you have incurred more on each of 110 kgs, so it's going to be 440 adverse. So net off, if you see 440 adverse minus 180 favorable, there is a net adverse of how much? 260 adverse. Are you guys clear with this? Right? And that's about this particular variance also. Guys, are you all able to understand? That's about it. Now comes your material usage variance. Material usage variance. So what is the formula for material usage variance? You guys tell me. So the material usage variance is going to be, right, standard quantity minus actual quantity into standard price, right? So this is the quantity, right? The quantity you should have consumed minus the quantity you have actually consumed into standard price. This is what we have seen, logic and everything we have seen now. Now guys, now material usage variance. What you need to do once again, so component wise you just need to compute, right? Once again they have mentioned all this. This is not required. Fine. What you need to do, so product wise you need to compute 80.888 for first raw material A. Standard quantity is 80.88888, but actual quantity was how much? 90, correct? So which means you are supposed to consume only 80.88888. You have actually consumed how much? 90, right? Into standard price 20. So what you need to do, 80.88888 minus 90. Literally you have consumed 9.11111 kgs more, right? So 80.88888 minus 90 into, so how much is this? 20. So how much you get? 182.22222 adverse. Are you guys clear with this? Here what they have done, 80 into 182 by 80. So all those things are not required. Directly we have computed. So 80.8888. That's all you need to write here. So you just need to write 80.88888 minus 90 into 20. If you do the calculation, you get 182.222 adverse, right? Similarly, for material B, 121.33333 minus 110. You should have consumed 121.333, but you have actually consumed only 110. Guys, are you all able to understand? Right? So the difference is how much? 121.33333 minus 110. You get how much? So 11.33333 into standard price. How much is standard price? 30. How much you get? So 339.999, or in other words, it's going to be 340 favorable. You were supposed to consume 121.33. You have consumed only 110. Your consumption is less, which means it's savings in cost. So it's a favorable variance to the extent of 340. Are you guys clear with this? So here it's going to be 121.333. I'm putting it down. 121.3333 minus 110. That is what has been mentioned here. Minus 110. I think there's a mistake. Right? Minus 110. Right? Into standard price, which is 30. If you calculate exactly, it is going to be how much? 340. So what's going to be your total usage variance, guys? Your usage variance is 182.222 adverse for A, 340 favorable for B. So now what happens? Net off 340 minus 182.22222. You get how much? 157.77777. You get it as favorable. Clear with this? Clear with this? Right? So this is what you get it as. This is what you get as your material usage variance. Now quickly, I'll go here and sum it up. Quickly, I will just go here and sum it up. Till now, what have we got? So material cost variance. How much was the amount we got? We got 102.2222 adverse. Now this is bifurcated into two. What and what? Material price variance, material usage variance. Now how much is my price variance? We calculated it was 260 adverse, and the usage variance we calculated just now, it was 157.77. it was roughly 7777. It was going to be favorable, right? Or you can put it as 777 or 78. So if you net off these two figures, if you add these two figures, you should get your topmost figure. Let us check that. So 260, it is adverse, and favorable is 157.78 roughly. So minus 157.78. If you do net off, you get how much? 102.22222 adverse. Clear with this, guys? So it is an arithmetical check which you can do. If you add your price variance plus your usage variance, you should get your top figure called as material cost variance. So this is one check that you can do. Clear with this, guys? Perfect. Now I told you this usage variance can be further categorized into two more. What and what? Material mix variance and material yield variance. Clear with this, guys? Right? Now, sir, how do we compute it? You gave some formulas and all. So now, sir, how do we go about with this? Now, I will walk you through here. First, material usage variance. You guys tell me, what is the formula? First, who is responsible for this? Obviously, your production manager, right? So now the formula for this is going to be standard quantity minus actual quantity into standard price. Correct? Now, I told you guys, this is bifurcated into two. What and what? Material mix variance, material yield variance. Material mix variance, the formula is going to be revised actual quantity minus actual quantity into standard price. Right? Now, what is the yield variance? Now, yield variance is ideally the balancing figure. Now, if you notice, now I have on the outside, within the bracket I have something. On the outside I have standard price, correct? So clearly here also I have standard price. Outside here also I will have standard price. Now look at this. On the top I need to get standard quantity minus actual quantity. Whereas on the left side I have RAQ, something new was introduced, revised actual quantity minus actual quantity. But if you notice, if I add my mix and my yield variance, I should get my top figure. Right? Now I should get standard quantity minus actual quantity. But as of now I have what? RAQ minus AQ. So minus actual quantity I have. But here I have introduced a guy called as revised actual quantity. So now what should I do? I should ideally get standard quantity. Right? But now I have revised actual quantity. So literally what I will do, here I will introduce standard quantity and I will subtract revised actual quantity. Sir, why do you do this? Simple. Only then, if I add the two, what happens? Revised actual quantity is here. Now this will get knocked off with minus revised actual quantity, right? And if I add the two, I will get standard quantity which I want minus actual quantity, right? The whole into standard price. Clear with this, guys? Or in other words, this is nothing but balancing figure, right? I will also tell you the logic, don't worry. Or if at all you forget, you can remember only this. The other one is a balancing figure. So I have R revised actual quantity minus actual quantity, but I want a standard quantity minus actual quantity. So minus actual quantity is already there. So what I need, sir, I need to replace RAQ with SQ. So SQ minus RAQ. Only if I do that, RAQ gets knocked off and I get standard quantity, and minus actual quantity is already there into standard price. Clear with this, guys? But before that, first, sir, why do we do this? I will tell you how to compute revised actual quantity. First, I will tell you, and then you will be able to understand. First, material mix variance. Let us do this. Now, so your raw material, revised actual quantity, standard price, and your material mix variance. Now, guys, first, fill this column actual quantity. Now, let me go back to the question. Now, what is my actual quantity? Here we have 90 kgs of A and 110 kgs of B. Correct? So I'll put it up here. It's going to be 90 kgs. So first A and B I will write down. A, B, then I'll write down the total. actual quantity is how much? 90 kgs of A and 110 kgs of B. So the total was how much? 200 kgs was the actual quantity consumed. Correct, guys? Right? I'm talking about the input. Right? Now, what you do? Revise the actual quantity. Take the total and put it here. How much was the total actual quantity? 200. Perfect. Now, revise the actual quantity means what? Fine. You have actually consumed a total of 200 kgs. Fine, be it so. But this 200 kgs of total actual input should have been consumed in the standard mix, the proportion. What is the proportion in which you should have consumed? Sir, 40% should have been A, 60% should have been B, right? So now what I will do, I will take the total actual input, right, and I will revise that actual quantity for the standard mix. 40% should come from A and 60% should come from B. That's what the question says, 40 for A and 60 for B, right? So 40 A and 60 B. So now put it here. So 200 into 0.4, 40 for A. How much is it coming out to? 80 kg should have been A and 60% for B. So 200 into 0.6 is going to be how much? 120. Literally, guys, this should have been 40%. This is 60%. Are you clear with this? So I introduced a column called revised actual quantity. Means what? I take the actual quantity and I revise it only for the mix. Sir, it should have been, for some reason you have consumed actual quantity of 200. I am not comparing standard with actual. I am comparing here what I am doing. Sir, actual quantity itself I am taking and I am revising it for the standard mix. Clear with this, guys? So here literally I'm comparing actual quantity at standard mix with actual quantity at actual mix. Mix means proportion. Clear with this, guys? So the actual quantity, this itself should have been in what mix? 40:60, right? But so that's why I revised my actual quantity. Clear with this, guys? And that I am comparing with the actual quantity, right? Clear with this, guys? So now, how much is the standard price? I mean, for this question, standard price, we already know. The standard price is here, 20 and 30 respectively. Let's put it up here. It's going to be 20 and 30 respectively. So now what is my material mix variance? You could have consumed 80. You've consumed how much? 90. Clear with this, guys? So now, how much you consumed? 10 kgs more into 20. So 10 into 20, how much you get? You get 200. Is it adverse or favorable? Obviously adverse. You've consumed more than what you're supposed to. And how about here? 120 is the revised actual quantity minus 110. You are allowed to incur you are allowed to consume 120. We only consumed 110. So 10 kgs less into 30. How much does that come out to? It's going to be 300 favorable. So the net of these two comes out how much? 300 favorable, 200 adverse. Net off is going to be 100 favorable. Clear with this, guys? Now, sir, what do we calculate in this material mix variance? What does this indicate? Simple. Understand, guys, here if you notice, we are not comparing standard quantity with actual quantity. We are only comparing actual quantity with actual quantity. Then what are we comparing, sir? Actual quantity at the standard proportion, standard mix is being compared with the actual quantity as at actual mix. Now, for some reason, you have actually consumed 200 kgs. Let me keep it there. But this 200, at least, you should have retained the mix. Correct? Now, what has happened? This 200 kgs, at least, it should have been in the ratio of 80 kgs of A and 120 kgs of B. Whereas what you did, 90 kgs of A you consumed and 110 kgs of B you had consumed. Clear with this? Now, between A and B, which is a costlier raw material? Obviously, raw material B, 30 rupees per kg, sir. Whereas raw material A is only 20 rupees per kg. Now, what these people have done, literally for A, cheaper raw material, instead of 80 kgs, they have consumed 90 kgs. Or in other words, they have consumed 10 kgs more of a cheaper raw material. So how could they consume 10 kgs more? Because in raw material B, costly raw material, they consumed 10 kgs less. Or in other words, they changed the actual mix. The actual proportion was 90s to 110. How, sir? They consumed less of a cheaper raw material and more of a costlier. I mean, they consumed less of a costlier raw material. A costlier raw material was consumed less, and this kgs, 10 kgs, they actually consumed more of a cheaper raw material. Now, if you sacrifice a costlier raw material and instead that you use it in actually a cheaper raw material, what happens? Obviously, you will save some cost. Clear with this, guys? Or in other words, this 100 rupees of favorable variance has clearly been achieved not because of efficiency, because I deviated from the mix. This is nothing but adulteration. Sir, here I should have used what? I should have used 80 kgs of A and 120 kgs of B. But what I did, that's how 200 should have come. But this 200, how I achieved? Right, 10 kgs less I consumed B. 110 kgs only I consumed. What I did, this 10 kgs I added here in A. Right, instead of 80 I consumed 90. So I consumed more of a cheaper raw material, less of a costlier raw material. Because of this, I achieved this 100 rupees of favorable variance. Ideally speaking, this 100 rupees of favorable variance is not because of the efficiency of the production manager to the extent of material mix variance. Here, this favorable 100 rupees of variance is purely attributable to your adulteration, the mix. Clear with this, guys? So what we are doing here, the usage variance overall is being further classified into mix variance and yield variance. In the mix variance, we are calculating not standard and actual, we are comparing look, because of deviating from the mix, how much is it contributing to your total variance is what is being found out in this particular material mix variance. Are you guys clear with this? Now, on the other hand, you have material yield variance. Here, what do we compare? The balancing figure. Standard quantity minus revised actual quantity into standard price. Now, clearly understand here. Here, we are comparing the standard quantity with the revised actual quantity. Clear with this, guys? Clear with this? Sir, why, sir? Now, if you notice here, standard quantity and revised actual quantity is being consumed. Here we compare the standard quantity. Obviously, the standard quantity will be in 40s to 60 in the standard mix. We compare that with revised actual quantity. We are comparing the actual quantity at standard mix. So literally here we are not capturing any variance happening on account of mix, because this is also in 40-60 ratio. This is also in 40-60 ratio, revised actual quantity. So here the deviation in the mix is being separately captured here. So we don't consider any mix variance here. Here we only look at the overall quantity difference. Standard quantity is being compared with revised actual quantity. So because of the overall consumption, the quantity difference alone, how much is going to be your variance is what is being captured under material yield variance. Clear with this, guys? Or in other words, literally you have standard quantity, you have actual quantity. In between, I introduced a guy called revised actual quantity. Now, this variance, usage variance, talks about standard quantity compared with the actual quantity. Now, what I did, first mix variance, I compared what? Revised actual with revised actual quantity with actual quantity. And now in the yield variance, I'm comparing standard quantity with revised actual quantity. This way, I have broken down the material usage variance into material mix variance and material yield variance, where mix variance captures the deviation happening, the variance happening on account of change in the mix composition, whereas the yield variance captures the variance happening on account of deviation in the overall quantity consumed, while this will not capture any difference in the mix, because that has already been captured under mix variance. Are you guys clear with this? This is how you need to learn this area. Nothing needs to be mugged up. So now just fill in the blanks, and that's about this area. So now what do you need to do? Standard quantity minus revised actual quantity into standard price. This is what you need to do. Simple. So raw material A. What is the standard quantity? Now standard quantity here, raw material A, raw material B. Let's put it up here. What's the standard quantity? Maybe you can just take it from here. Standard quantity is 80.888888 and 121.33333. So 80.8888 and it's 121.3333 minus revised actual quantity 80 and 120. So it's going to be 80 and 120 into what is the standard price? 20 and 30 respectively, right? So how much is this? 80.888888 minus 80, right? So you were allowed 80.88, you have only consumed 80, so 0.8888 less into 20 How much you get? 17.7777 favorable. 17.7777 favorable. Similarly here, 121.3333 is what you are allowed to spend, consume, but you have consumed only 120, so 1.333 kgs less into 30, you get how much? 39.9999, or it's going to be 40, once again favorable, right? So it's going to be total 57.77777 favorable. Clear with this, guys? Or here, if you notice, my mix variance is 100 favorable and my yield variance is 57.77777 favorable. Are you guys clear with this, right? So here, material mix variance, I'm updating. It is going to be how much? 100 favorable, and material yield variance is 57.777 or 78 favorable. Clear with this, guys? Once again, here you can check material mix variance plus material yield variance. So 100 plus 57.78 gives you 157.78, your material usage variance. Or in other words, what is the understanding, sir? Sir, production manager, how much is the variance he is responsible for? Usage variance 157.78. Very good, sir. Very efficient. No. To the extent of 57.78 shows his efficiency, because that is the difference between standard quantity and revised actual quantity. Standard is compared with actual. Whereas to the extent of 100, it was not because of his efficiency, because he used more of a cheaper raw material and less of a costlier raw material. Because of the change in the composition, 100 rupees was the actually variance that is attributable to this. So clearly now you can understand and judge. Now the managing director will not be happy for this 100 favorable variance. It is impacting on the quality of the product. Clear with this, guys, right? So literally, genuinely, he should be rewarded only for this yield variance, for which genuinely it is because of his efficiency level. Mix variance is because of adulteration with this guy has done. Clear with this, guys? So this is the beauty of marginal costing. It will break down every single, your standard costing, it will break down every single variance and clearly tell who is responsible for what variance to what extent, and the reason. If you know for every single variance, nothing more you need. Clear with this, guys? And that's about this particular question. Now, guys, I told you for your material yield variance, you also have two other alternative formulas. Quickly, let me just walk you through that also. Now, another formula for material yield variance is actual yield minus standard yield into standard cost per unit. Now, let me just write it down here. Material yield variance. Yield means output. What was the formula we saw here? Actual yield minus standard yield into standard cost per unit, right? All these three are new terminologies. What it is, I will tell you, right? You can easily understand. Now, first, standard cost per unit. Per unit means it is not per kg of input, it is per kg of output. Clear with this, guys? What is it? I will tell you. Now, literally we saw standard, we computed, right? Overall, you should have incurred a cost of how much? 5257.777. You should have incurred this cost for an effective output of how much? 182 kgs, which means what is the standard cost per unit of output? In this case, the output is also in kg. So per kg of output, what is the cost you are allowed to incur? So 5257.77777 divided by 182. How much you get? 28.888888, right? So clearly I will say here the standard cost per unit of output or per kg of output is going to be rupees 28.888888. Clear with this, guys, right? So suppose if they ask, you can actually do it in this way also. Now in your CMA intermediate, right, you have this formulas, these alternate formulas. In your CA intermediate, these formulas are not there as such, but at times I have also seen institute suggested answers where they have used this formulas. In RTP I've seen a couple of times where they have used this formula also. So it is not like it's not there for you. Definitely these are concepts of standard costing globally are there, right? So they are one and the same. So there's nothing like specific for CA inter or CMA inter here. Clear with this, guys? Now the standard cost per kg of output is how much? 28.888888. Clear with this? This is the cost per kg of output you are allowed to incur. Now, yield means output, right? Actual yield minus standard yield. What is the actual yield? Actual yield is actual output. How much is the actual output the company has achieved? 182 kgs. Correct? So put it up here. 182 is the actual yield. Now standard yield here means, please understand, here it's nothing but standard output for actual input. Sir, what is the meaning of this? I will tell you, and logically also we will understand this. Now, actually I have inputted a total of how many kgs of input? 200 kgs of input, correct? Now, they have mentioned in the question a standard loss of 10% is allowed, correct? Now, a standard loss apply on the actual input 200 kgs, right? Now, you are allowed, let us say, for 200 kgs, assuming after allowing for a 10% of standard loss, so minus 10%, how much is that? 20 kgs. You would have got an yield of how much? 180 kgs of output. Output you would have got how much? 180. I'm repeating, the standard yield, the output, standard output for the actual input will be how much? 200 minus 10% loss, 20, gives you how much? 180. This is called standard yield for the actual input. Clear with this, guys? How much is it? 180. Clear with this, guys? 180. Now what they are saying, for the actual input, they kept input as the base here. You have actually achieved how many kgs of output? 182. But you should have ideally got only 180 kgs of output. Clear with this, guys? So literally you have got how many kgs of output more? 2 kgs of output. Clear with this, guys? This is kg of output, correct? Hence I am multiplying this with standard cost per unit. Now 2 into 28.888888, how much you get, guys? How much you get? This is nothing but, here you get 57.77777. Is it favorable or adverse? Obviously favorable. You have actually got an yield of 182 units or kgs, but you should have got, for the actual input that you had inputted, you should have got only 180. So 2 kgs you've got more, and every kg is valued at a cost of 28.8888. Literally you have got yield variances how much? 57.777 variable favorable. Clear with this, guys? This is exactly what we got using that formula also. This formula also you got 57.777, right? That is exactly what we've got here as well. Clear with this, guys? This is another way of computing. Or there is one more formula. What is that formula? Standard loss minus actual loss into standard cost per unit. I'm putting it here. Standard loss minus actual loss into standard cost per unit. Now standard cost per unit, you guys know it's 28.888888, right? Now standard loss minus actual loss, what it is, clearly understand here the wordings are a little different. Actual loss, actually I've lost how much? Sir, I inputted 200 and I got 182, which means actual loss was how much? 18. But for the actual input, what is the loss I could have earned? I mean, what is the loss that was allowed for the actual input? 10% was allowed. 10% on 200 is how much? 20. So you could have lost 20, but you have lost only 18. Clear with this, guys? Right? So standard loss here represents standard loss for actual input. Clear with this, guys? So standard loss for actual input, for this two formulas alone, the actual input is kept as the base. Are you guys clear with this? Right? So the standard loss for actual input, how much is it? 200 you have actually inputted. For that you could have lost how much? 20 kgs, but you have lost only how much? 18 kgs. Since you lost 2 kgs less, ideally this is the reason why you got 2 kgs more as an yield, guys, correct? Or in other words, the difference in your output is nothing but the difference in your loss, guys. Clear or not? That is the reason why you got an yield variance. So how much is it? The same 20 you could have lost, but you've lost only 18. So 2 kgs you've lost less. So 2 into 28.888888. Literally, what do you get here? You get 57.77777. favorable. The same answer you will get under all the three methods. Correct. This is for yield variance. First formula is standard quantity minus revised actual quantity to standard price. You use this formula generally. Suppose they have asked in a particular question, calculate the yield variance alone, right? And they have not given all this data. They have given actual yield, standard cost. Based on this, they have given all the data. Only then you will use either of these two formulas. Are you guys clear with this? This could be a trick hack in your exam. In case they ask this, you can cover this also. Are you all able to understand this? And that's about this question. A comprehensive question covering one question that covers the entire concept of material cost variance with all possible adjustments, right? And this was once tested as a past exam question as well, right? Definitely it will carry a huge weightage in your exam. Fine, guys. So please go and update your library of adjustments. Write down material cost variance hyphen mix of raw material with losses. Mix of raw material with losses. A very good question, a signature and a masterpiece question, a must visit the day before your exam. That is the kind of importance I would attach to a question like this. So please mark this as a very, very important question. Fine, guys. Perfect. So now let's move on to the second segment of discussion, which is labor cost variances. Right? Fine. Now, guys, labor cost variances is exactly same as your material cost variance. Only one difference is here. Now, instead of quantity, here you have hours, right? There it was standard quantity, actual quantity. Here we have standard hours, actual hours. There we had price. For material, we call it as price. Standard price, actual price. Here we use standard rate, actual rate. So instead of price, here we have rate. Instead of quantity, here we have hours. That's all is the difference here. Look at this. Labor cost variance. What is the formula? The labor cost which you should have incurred, standard hours into standard rate, minus the actual labor cost you've incurred, actual hours into actual rate. Now, it's bifurcated into two. What and what? Labor rate variance and labor efficiency variance. Now, who is responsible for rate variance? The HR manager of the company. Now, he is responsible for negotiating the wages with the workers. Now, so what is his responsibility? Rate. So, standard rate minus actual rate into actual hours. Why? He doesn't decide for how many hours he should make the workers work. That is a decision of production manager. So, literally, for the actual hours which the production manager is making the workers work, our HR manager is responsible only for the rate. Hence, that is going to be standard rate minus actual rate into actual hours. Whereas on the other side, labor efficiency variance, whose responsibility is this? The production manager's responsibility, right? So what is the formula? Standard hours into standard rate into, standard hours minus actual hours into standard rate. Why? Here, the HR manager is, the production manager is not dependent on the HR manager for anything, right? Suppose instead of standard rate, if I take the actual rate here, then I am passing on the efficiency or inefficiency of the HR manager to the production manager, which is wrong. That is the reason why here have standard hours minus actual hours into standard rate. Are you guys clear with this? Now, efficiency variance is further classified into two: labor mix variance and labor yield variance. Mix variance is also known as gang variance, right? And yield variance is also called as sub-efficiency variance, right? Efficiency, this is sub-efficiency. Simple. When will these two variances, mix and yield variances, when will they arise? When a company is using more than one type of skill set laborers, that is skilled, semi-skilled, unskilled. When I have more than one variant of workforce, labor force, in that case I have mix variance and yield variance. Now, what is the formula for mix variance? Revised actual hours minus actual hours into standard rate. Exactly, everything is same. Here you have what? Balancing here. Standard hours minus revised actual hours into standard rate. By the way, guys, I think I forgot to mention this. Now, earlier we had this in your material mix variance, I told you the formula is revised actual quantity minus actual quantity to standard price, right? Now, for examination purpose, logically speaking, revised actual quantity is the more sensible usage because the actual quantity is now being revised. Correct? So on the actual quantity, I'm revising. Revising with what standard? That's why I'm calling it as revise. So the revision happens on the actual quantity. But in exam, in your study material, both in CA as well as in CMA intermediate study materials, they have mentioned this as revised standard quantity. That is, the manner of computation is same. The terminology alone, the wording alone, they have made it differently, right? Instead of revised actual quantity, it is better to mention it as revised standard quantity. In exam, just write it down as revised standard quantity. But however, you remember, the manner of computation is same. Clear with this, guys? That's why I told this as revised actual quantity and did, so that, you know, for understanding purpose, you will understand the logic. Right? Later on, at the end, I wanted to mention it as revised standard quantity. That's why I have put a circle here and written it down as revised standard quantity. Just in examination, use the words revised standard quantity. Manner of computation, same. Now, here, what do we have? So, similarly here, revised actual hours. Actually speaking, what do we do? On the actual hours, we revise it for the standard mix. But in examination, write this as revised standard hours. Right? The terminology around is different. The manner of computation is exactly the same. Clear with this, guys? And or there is another formula here. Actual yield minus standard yield into standard cost per unit. Here you don't have the loss because in labor there is no concept of loss. So actual yield minus standard yield into standard cost per unit. This is another formula exactly same as what we saw in our material variances. Now, sir, without any further delay, let's go and do a few numerical problems. With the help of that, we will complete this aspect also. So that's all, sir, in labor cost variances. There is one more thing called as idle time variance. What is it and all? I will just walk you through with the help of a numerical example. Quickly, let's get started. Now, please take your CA intermediate, once again, CA intermediate solved question bank. Right? Please take question number 4. Please take question number 4. Yes, please take question number 4. Right? This is definitely applicable even for CMA intermediate students. Don't think that it is something applicable only for CA inter students. Nothing of that sort. It's applicable even for CMA intermediate students. Right? So I will definitely not take something which is not applicable for one particular set of students. If that is the case, then I will make it separate. Nothing to worry, and I will clearly mention what is what as well. Right? So come on, let's get started. The standard and actual figures of the firm are as under. Standard time for the job. For a job, you are allowed to take how many hours? 1000 hours. Okay, perfect. So this is nothing but your standard hours. What is the standard rate per hour? Every hour you should have paid how much? 50 rupees. Actual time taken, 900 hours. It is actual hours. Actual wages paid, how much was it? 36,000. What is the meaning of this? Literally, actual hours into actual rate is equal to how much? 36,000. So now with this we can compute actual rate, no? Yes, how? Because actual hours was how much? 900 rupees, 900 hours. So 900 hours into actual rate would have been 36,000, or actual rate is equal to, so 36,000 rupees is the overall labor cost for 900 hours. What is the cost per hour? It's going to be 4 rupees per hour. It's going to be 40 rupees per hour. So, yes, 36,000 divided by 900. It's going to be 40 rupees per hour. Clear with this, guys? So now we have all the ingredients. Standard hours, 1000. Standard rate, 50. Actual hours, 900. Actual rate is 40. So now you just have to go ahead and compute. So what is going to be a labor cost variance? So now quickly, I will just write it down here. One second, I will just take the question for my reference. That easy. I hope you guys have downloaded the materials. So yes, writing down, this is question number 4. Yes. So question number 4. So standard hours is going to be 1000 hours. Standard rate is going to be 50 rupees per hour. And the actual hours is going to be 900 hours. And the actual rate is going to be how much? Rupees 40 per hour. Now, what is going to be my labor cost variance? Standard hours 1000 into standard rate 50. This is the cost you should have incurred. Whereas actual cost is how much? 900. Actual hours into actual rate. So it's going to be 50,000, one second, yes, 50,000 minus, so 900 into 40 is going to be 36,000. So you were supposed to incur a cost of 50, but you have incurred only 36,000 rupees of labor cost, which means there's a 14,000 rupees of favorable variance, right? This is bifurcated into two. What and what? Labor rate variance and labor efficiency variance. That's about it. Labor rate variance. What is the formula? Who is responsible? The HR manager. Hence, what is going to be the formula? Standard rate minus actual rate into actual hours. So you should have paid 50, but you've paid only 40 on how many hours? Actually 900 hours. So on each of these 900 hours, you've saved 10 rupees for the firm, for the company, which means how much is the rate variance? So it's going to be 900 into 10, 9,000, obviously favorable. You've saved money for the company. And on the other hand, the efficiency variance is what? Standard hours minus actual hours into standard rate. How much is this going to be? Standard hours. Every hour, I mean, you should have spent a total of 1,000 hours, but you've actually spent only 900 hours into what is the standard rate? It's going to be 50. So you've saved 100 hours for the company. So 100 into 50, how much is that going to be? It's going to be 5,000, right? And it's going to be favorable. So you can also check. It's going to be 9,000 favorable plus 5,000 favorable. You get your top figure, 14,000 favorable. As simple as that, guys. Logical, simple, and straightforward. Literally, look at this. We spent very little time in labor variance. Why? Because the foundation of this, we actually spent more time on material cost variances. As simple as that. Nothing beyond it. So please go and update your library of adjustments. Write down labor cost variance hyphen single skill set. Only one skill set is that. That is, there is no mix of skill set and all. Please write down single skill set within bracket without idle time. Within bracket without idle time. Within bracket without idle time. That's about it. Look how beautifully we can cover this area. So that's why we spent more time on material cost variance, and the two other variants, labor and variable overhead variances, are very similar to the concepts which we have studied there in material variance. That's why there's a beautiful saying of Abraham Lincoln: if you give me 6 hours to chop down a tree, I will spend the first 4 hours sharpening the axe, right? So we spent more time on the preparation so that the execution takes only a lesser span of time. That's about it. Now, please go to the next question. We can take question number 5 from the same CA intermediate only solved question bank. We will take question number 5, and with the help of this particular question, we will see the treatment in case of idle time. All right. Now, quickly, the standard output of a product X is 25 units per hour in a manufacturing department of a company employing 100 workers. Perfect. Now, what have they mentioned? Right? The standard output of a particular product is 100 units per hour in a manufacturing department of a company employing 100 workers, which means what? If 100 workers simultaneously, if they are working for 1 hour, 25 units can be produced, or in other words, can we say 100 man hours. If you spend 100 hours totally, that is 100 workers each spending 1 hour, means what? 100 man hours if you are spending, you will be able to generate how many units? 25 units. This is the standard. Next, the standard wage rate per labor hour is 6. So per person per hour, per man per hour, I'm going to pay them. You are allowed to pay how much? 6 rupees. Next, in a 42-hour week, in a week there are 42 hours, the department actually produced how much? 1040. The actual output, this is the base for all calculations, is 1040. Despite 5% of the time paid being lost due to abnormal reason. The hourly wages actually paid were 6.2, 6 and 5.7 respectively to 10, 30 and 60 of the workers. Calculate the relevant labor variances. Now guys, now a very important calculation is something that we need to do here. Now if you notice what has happened here. Now there is no multiple skill set of workers and all. Look, 100 workers you have. All the 100 workers should have been paid at the rate of how much? 6 rupees. But what did this HR manager do? To 10 workers, for 10 workers, maybe his relatives and friends, he paid more. 6.2 he paid, right? Then for 30 workers, he paid 6 rupees, maybe strangers. Then for balance 60 workers, he paid 5.7 rupees, his enemies, right? He paid less. Clear with this, guys, right? Actually seeing there is no multiple skill set, but this HR manager, he has paid a different amount for a different set of people. Why? For some reason. Clear with this, guys. Now we need to calculate all the relevant labor variances. Now how do we go about with this question? Now this is fine. The rate variance can be calculated separately for 10, 30, 60 workers. That is not a problem. Look at this. 5% of the time paid have been lost due to abnormal reason. Now how do you go about with this? First of all, guys, there is a very, very important calculation that we need to do. Now first, we need to calculate the total standard hours that you should have taken. Now, clearly we know that 100 hours, totally 100 hours, 1 hour where 100 people are working is equal to 100 man hours, right? So 100 hours you are allowed to take to produce how many units? 25 units. So to produce 1040 units of output, how many hours you should have taken is what we need to calculate. That is called a standard hours, guys. Correct? Simple. So how do you do? If 100 hours is allowed for 25 units, how many hours are allowed for 1040 units? 100 divided by 25 into 1040. Clear with this, guys? So 100 divided by 25 into 1040. That is what I have mentioned here. So 100, okay, 100 divided by 25, if you do, clearly you will get 1 unit you are allowed to take 4 hours. So 4 into 1040. You can also do it like this, or 100 by 25 into 1040. You are allowed to take a total of how many hours? 4160 hours. Are you guys clear with this? So you are allowed to take 4160 hours. Clear with this, guys? This is a very, very important calculation that you need to have. Fine, guys? Now, very good. Now, what has happened? This is the standard hours which we have now computed. Now, look at this. In this particular question, there is one more unique adjustment. What is it? 5% of the time paid has been lost due to abnormal reason. What is the meaning of that? Now, first, let me clearly put it in a tabular format. Then you guys will be able to appreciate this in a much more easier manner. Now, what is the standard hours you are allowed to take? 4160. Perfect. Now, what has happened? Let us look at the actuals. Now, actually, if you notice, please have the question with you. If you notice, right, what has happened is that, so number of workers, if you see, this HR fellow, he has actually categorized them into so many different workers. That is 10 workers, 30 worker, 60 workers and all. He has categorized overall 100 workers totally. Now, what has happened? Actual hours for which I am going to pay them, I call it as actual hours paid. Clear with this, guys? Now, actual hours paid. Now, for how many actual hours am I going to pay them? Simple. They have come to my factory and they have spent 42 hours in my factory. Clear with this, guys? So literally for all the workers, 100 workers, sir, they worked here. Correct? So 100 workers, each of them have spent 42 hours in my factory. So literally 100 into 42, total hours for which I need to pay them is 4200 hours, right? Fine. Category of worker, you can say. So you have 42 into 10 is equal to 420 for this 30 workers. So 42 into 30, it's going to be 1260, and 42 into 60 is going to be 2520. Clear with this, guys? Right. Next one. Now, what they have mentioned here, there is an idle time of how much? Sir, 5% of the total hours for which I am paying them is idle time. Or guys, simply put in other words, simply, guys, so now 10 workers are working for a total of how many hours? I mean, they didn't work. I am paying them for how many hours? 420 hours. So 0.05 into 420. How much does it come out to? 21 hours. So 21 hours are idle time. That is meaning these 10 workers are, I pay them for 420 hours. But out of this 420 hours, 21 hours they didn't work. Why? It was not because of their problem. Maybe power cut has happened. Because of that, they were sitting in dark. Machines will not work. Right? Literally, 420 minus 21. This is going to be the actual hours worked. How much is that? 420 minus 21. How much is that going to be? 399. They have actually worked for 399 hours. But abnormal idle time was for 21 hours, for which I can't penalize them. It was an issue with the company. So overall, I have to pay them for 420. The breakup of 420 hours, actual hours I'm paying is 21 hours idle time and 399 hours is the actual hours worked. Clear with this, guys? Similarly here, 1260. So 0.05 into 1260 is equal to how much? It's going to be 63 hours of idle time. Right, and here 2520 is equal to how much? 126 hours of idle time. So out of the total 4200 hours, 5%, 210 hours are idle time. You can add it up, you get only 210. Clear with this, guys? Which means the remaining 95% is only the actual hours worked. So 1260 minus 63. So 1260 minus 63, you get actual hours worked 1197. 2520 minus 126, you get 2394. You add up everything. So plus 399 plus 1197 plus 23794, you get 3990. This is the actual hours for which they are working. Now guys, now you tell me one thing. Now labor cost variance, what is the formula? Standard hours minus actual hours, right? Sorry. Standard hours into standard rate minus actual hours into actual rate. Right? Fine, guys. Sorry for this. I mean, someone knocked the door, so there was an attention lapse. Coming back here, the labor cost variance is going to be standard hours into standard rate minus actual hours into actual rate. Correct? Now here, actual hours is going to be actual hours for which I am paying overall. Let's not take the breakup. Overall, 4,200 hours I am going to pay them. Guys, clear with this? So here I only take the actual hours for which I'm paying them. Now, this is broadly bifurcated into two. Labor rate variance and labor efficiency variance. Here, in labor rate variance, right, who is the responsible person? The HR manager. So, standard rate minus actual rate into actual hours. What will I take? Actual hours paid. That is, I'm just talking about the total. Forget this breakup, right? Actual hours paid or actual hours worked. The HR manager needs to pay them for 4,200 hours, not for 3,990 hours. They have worked for 3,990, but anyways, he needs to pay them for 4,200 hours. So here, it's going to be actual hours paid only. Are you all clear with this? Now, go on to the other side. Efficiency variance. So who is responsible? Production manager. What is the formula? Sir, standard hours minus actual hours into standard rate. Now, if you look at it, standard hours, we calculated already. Sir, for this task, you are allowed to take a total of how many hours? 4,160 hours. So, I am putting it here somewhere. Standard hours is equal to 4160 hours. Now, we are judging the efficiency of the workers. Now, you should have taken how much? 4160. Now, minus actual hours. Now, here will I take actual hours paid or actual hours worked? Or in other words, will I take 4,200 hours or will I take 3,990 hours? Now, you guys tell me, we're allowed to take 4,160 hours. However, effectively, these guys completed the job in 3,990 hours itself, right? Sir, then this extra 210 hours is not a time that these guys took. Right? So please don't consider this 210 hours. If you add 3990 plus 210, you get 4200. Correct? Now, please don't say that we have taken 4200 hours. The employees are saying, sir, we took only 3990 hours and we completed the job. Extra 210 hours, we were made to sit idle because there was a power cut. Please don't put it in my efficiency. So literally, for judging the efficiency, what will I say? Standard hours minus actual hours worked will only come. Clear with this, guys? So standard hours 4160 minus actual hours worked will only come, right? Clear with this, into standard rate. Are you clear with this, guys? Are you clear with this? Now you tell me, sir, on the top, literally, sir, we have considered only actual hours paid. Correct? Here also rate variance, actual hours paid only. He's not bothered about how much is worked, idle time and all. For every hour they spend in the factory, this HR will have to pay. But for efficiency alone, I took actual hours worked now, sir. Now, how will it tally? It will not tally. That's why you have another variance called as labor idle time variance. What is it? Simple. Now, the difference between your actual hours worked and actual hours paid is only your idle time, right? So, literally what we will do here is idle time into standard rate. We will take it here. Clear with this, guys? Idle time is how much? 210 rupees into standard rate you will take. This will always be an adverse variance. Are you guys clear with this? So literally, if you are having idle time, there is a third variance called as idle time variance. And in this case, clearly understand, guys, whenever you are having idle time, you have standard hours, standard rate, actual hours paid, actual hours worked. Difference between the two is idle time. So this is split into three, right? Not one actual hours. You have actual hours paid, actual hours worked. The difference between the two is called as idle time, and then you have actual rate. Are you guys clear with this? So when you have an idle time, in that case there is one more variance called as idle time variance. It's nothing but idle time into standard rate, or this idle time, guys, is nothing but actual hours worked minus actual hours paid. Are you guys clear with this? So literally, if you see here, if you add this up, actual hours worked and actual hours worked gets knocked off, right? And here standard hours minus actual hours paid only will come in. Are you guys clear with this? Or in other words, this is the logic for idle time variance. Now, sir, who is responsible for idle time variance? Idle time variance is the responsibility of the maintenance department. Are you guys clear with this? Why? Simple. Now, they should have made sure, these maintenance guys should have made sure that this 210 hours should not have been lost. Sir, if there is a power cut, you should have arranged for a generator, genset, right? Now, there should not have been a downtime or an idle time. But these guys were not efficient. Hence, I should pin it on the maintenance team. I should not pin it on my production team. Are you guys clear with this? Hence, I take this idle time separately, create a variance called as idle time variance, and then on that we compute. And that's how we pin on the responsibility to the maintenance department. Are you guys clear with this? Now, on this note, let's do all the calculations. Now look at this. This is what we have done. Standard hours is going to be 4,160 hours. Right? What is the standard rate in the question? The standard rate is given 6 rupees. So 6 rupees. If you multiply the two, this is going to be standard hours into standard rate. So 24,960. This is going to be the total labor cost you are allowed to incur. Guys, clear with this? But how about the actuals? We calculated the actual hours paid, idle time, actual hours worked. We calculated. Guys, clear with this? Now, what was the rate? Actual rate was given 6.2, 6, 5.7. So you have 6.2, 6, 5.7. So now, to compute the overall variance, so now we need to have here, we can have this column, actual hours paid into actual rate. Literally speaking, 420 into 6.2, 420 into 6.2, you have how much? 2604. 1260 into 6, how much you get? 7,560. Next, 2,520 into 5.7, 2520 into 5.7, you get how much? 15,364. You add up, this is the total labor cost actually incurred. Are you guys clear with this? So now, what is the labor cost variance? You were supposed to incur 24,960. You have actually incurred only 24,528. So the difference between the two, 24,960 minus 24,528 gives you 432. Favorable is going to be your labor cost variance. Are you guys clear with this? Very, very simple, guys, provided you have the conceptual understanding. Please do not fall into the trap of mugging up things here. It's all 100% logical. Next, what's going to be your labor rate variance? The formula is going to be standard rate minus actual rate into actual hours paid. Guys, correct? Who's responsible? We all know, the HR manager. Now, here 3 categories, we need to do it separately. Now, what is the standard rate? Always it is 6 rupees. So 6, 6 and 6. Whereas, what is the actual rate? Sir, for 420 hours, I used a rate of 6.2. right? For the next 30 workers, actual hours paid was how much? 1260. I paid them at 6 rupees. And for the next 60 workers, I paid them at 5.7. So there are three different actual rates here. So 6.2, 6, 5.7, correct? 6.2, 6, 5.7, right? So standard rate minus actual rate into actual hours paid, you can take these figures, 420, 1260 and 2520. Are you guys clear with this? You do all the calculations. So 6 you should have paid, but you've paid a 6.2, 0.2 more on 420. So 420 into 0.2 gives you how much? 84 adverse. 6 minus 6 into 1260 is 0. Then 6 minus 5.7, so you get 0.3. You have saved 0.3 rupees for the company on how many hours? 2520 hours. You get how much? 756 favorable. So net of 756 favorable minus 84. 756 minus 84, you get how much? 672 favorable. This is going to be what? This is going to be your overall labor rate variance. How about your efficiency variance? What is the formula? Standard hours minus actual hours worked into standard rate. Correct? Simple. In this case, what is the standard hours? 4160. What is the actual hours worked? Right? You can take the total. Why? Because into standard rate only we are doing, directly you can take the total. Clear with this, guys? You are allowed to take 4160 hours, but you have actually taken only 3990 hours. So literally how many hours you have saved? 4160 minus 3990. You've saved 170 hours for the company into 6. Literally 1020 rupees favorable. Look at this. 1020 favorable. Are you guys clear with this? Right? So that's about this. So 1020 favorable. Then the difference is an idle time. So how much is my idle time? So 210 hours, sir. So 210 into 6. So 210 into 6. 1260 adverse is going to be my labor idle time variance. Look at this. 1260 adverse idle time into standard rate 1260. It is always an adverse variance. Clear with this, guys? So now if you knock off these three, you will get your topmost figure, your labor cost variance. Let's check for this. So 672 favorable plus 1020 favorable. So 1692 you get minus 1260, you get 432 favorable. Clear with this, guys? That's about this question. Nothing beyond it. The only thing that you need to know is in this particular question, since idle time was there, in this case what you need to do is segregate your idle time separately and calculate an idle time variance. In that case, your labor efficiency variance will be standard hours minus actual hours worked. Correct? So because when I'm judging the efficiency, you should have taken so much hours and I should compare with how much actual hours you actually worked for. Clear with this, guys? So standard hours minus actual hours worked into standard rate. That's how it should be. And the difference between actual hours worked and actual hours paid, which is your idle time, that should be separately taken, idle time into standard rate. It's always an adverse variance which is captured, which is the responsibility of the maintenance department. That's the learning objective here. And with that, this particular variance, your labor cost variances with your idle time variance is also done. So please go and update your library of adjustments. Write down labor cost variance hyphen single skill set, labor cost variance hyphen single skill set within bracket with idle time. Labor cost variance hyphen single skill set within bracket with idle time. Right, guys? Fine. So in the marathon itself, we are doing a few numerical problems and all these are signature problems, right? You can expect these kind of questions as it is in the exam also, or maybe variants of this also you can expect. But the main objective here is from an examination perspective, as well as I'm picking up, hand-picking questions to cover all variety of concepts covered across this particular chapter. Clear with this, guys? Now on that note, let's do one more question here. One last question in this labor related variances. Please take question number 7 for the same CA intermediate solved question bank. Please go and take question number 7. Question number 7. Okay. So please take question number 7. Okay. Look at this. NPX Limited uses standard costing system for manufacturing its product X. The company is following a budgeted data given in relation to labor hours for the manufacture of 1 unit of product X. To produce 1 unit of product X, you are allowed to take 2 hours of skilled labor, 3 hours of semi-skilled labor, 5 hours of unskilled labor. Total is 10 hours. And every hour of skilled labor should be paid at the rate of 6. unskilled labor should be paid at the rate of 4, and every hour of semi-skilled should be paid at the rate of 4, and unskilled should be paid at the rate of 3. Now what happens? You have different skill set of workforce to produce every unit of a product. Now in this case, your mix and yield variance, right, will also come into picture. Your labor mix variance is also called as labor gang variance. That will also come into the picture. That's about it. For that purpose only, I've taken one more sum. In the month of Jan 2021, a total of 10,000 units were actually produced, right? And the following are the results. What have they given? Actual hours they have given here is going to be how much? 18,000 skilled, 33,000 semi-skilled, unskilled was 58,000. Total hours is given. Actual rate is also given. They have multiplied and arrived at the amount. Now, idle time, abnormal idle time during the month is also being given here. Calculate all the labor variances, right? Then they've also asked, show the effect of labor rate variance if 5,000 hours of skilled labor are paid at the rate of 5.5 and the balance are paid at the rate of 7. Now, let's focus on this, the first part of the question, the main thing here for this marathon. That's the most important thing. Now, guys, what have they given? Now, this is going to be, guys, this is going to be my actual rate, correct? Now, this is going to be my actual hours paid. Sir, how do you know? So this is actual hours paid. This could also be actual hours worked, idle time is there. Now, that is the reason why they have clearly given actual hours paid, right? You can check it. 18,000, right, into 7 will only give 1,26,000, correct? 18,000 into 7 is 1,26,000, right? Now, when they have given the amount, right, it means they are paying at the rate of 7 for how many hours? 18,000 hours, which means this 18,000 is not actual hours worked, it is actual hours paid. Clear with this, guys? Since they have given the amount, you can clearly take this as actual hours paid. Now, there were also some idle hours and all. So now what will you do? Sir, actual hours paid respective 3 types of labor. From that minus your abnormal idle time, you will arrive at actual hours worked. Clear with this, guys, right? So now this is also available for your information, and then you can go ahead and do this question, right, guys? So now what I will do is right now, first look at this. What is going to be the standard hours? How many units were actually produced? 10,000 units, which means 10,000 units you have actually produced. So you are allowed to take a total of how much? 10,000 into 2, 20,000 skilled hours, then 30,000 semi-skilled hours, then 50,000 unskilled hours. This is the time allowed, correct? Standard hours. So 20,000, 30,000, 50,000, right? Clear with this, guys? The total time that is allowed was how much? 1 lakh labor hours at the rate of how much? 6, 4 and 3. So this is going to be your standard rate. Are you guys clear with this? So standard hours we have, standard rate we have. If you multiply the two, standard hours into standard rate, right? So now you get the total labor cost which you are allowed to incur, right? So 20,000 into 6 is 1,20,000, 30,000 into 4 once again is 1,20,000, 50,000 into 3 is 1,50,000. So 1,20,000 plus 1,20,000 plus 1,50,000, how much is it? 1,20,000 plus 1,20,000 is 2,40,000, and 1 lakh, add 1,50,000 to that, you get 3,90,000. So 3,90,000 rupees is the labor cost which you are allowed to incur to produce 10,000 units of output. Clear with this, guys? Now what happened to the actuals? The actual hours paid is given 18,000, 33,000, 58,000. These figures are all given, right? The actual rate, this is also given 7, 3.5 and 4. In fact, these figures are also given. They have multiplied and given total actual labor cost incurred is how much? 4,73,000. So this is actual hours paid, this is actual rate, and this is actual hours paid into actual rate. Clear with this, guys? Now one more thing, please have it very clear in your mind. Idle time is also given in the question. 500, 700, 800 hours respectively. 500, 700, 800 hours respectively, which means actual hours worked is going to be how much? Simple. Actual hours paid. I paid them for 18,000, out of which 500 was idle, which means 18,000 minus 500, 17,500. Only effectively they worked. Clear with this, guys? 33,000 minus 700, 32,300. Similarly, 58,000 minus 800, 57,200. This is the actual hours worked. You get the total figures. So now we have standard hours, we have standard rate, we have actual hours paid, idle time, actual hours worked, then we have actual rate. Now literally all the ingredients are available. With this you can go ahead and do this question. Clear with this, guys? So first, labor cost variance. What is the formula? Standard hours into standard rate minus actual hours into actual rate. Simple. This is the labor cost you were supposed to incur. right? 3,90,000, but you've actually incurred how much? 4,73,500. So literally, if you subtract it, so how much is the difference? 83,500 rupees you have incurred more. So literally 83,500 rupees adverse is going to be your total labor cost variance. As simple as that. Just list out the ingredients required. Go ahead and crack the question. That's all is needed, guys. Clear with this. Next one, labor rate variance. Come on, tell me, what is the formula? Standard rate minus actual rate into actual hours paid. Correct? So now what you need to do here? Simple. So standard rate 6 minus actual rate 7 into actual hours paid 18,000. That is what we do here. 6 minus 7 into 18,000. Here what do you have? 4 minus 3.5 into 33,000. 4 minus 3.5 into 33,000. Similarly, unskilled, you were supposed to pay them 3, but you have paid them 4. Actually, for how many hours? 58,000. So 3 minus 4 into 58,000. For skilled, you should have paid 6, you have paid 7. 1 rupee more on how many hours? 18,000. So it is 18,000 adverse. That's all. Semi-skilled, you should have paid them 4. You paid them only 3.5. 0.5 rupees you saved on how many hours? 33,000. 33,000 into 0.5 gives you 16,500. Favorable because you paid less. You should have paid 3 for unskilled, but you've paid 4, which means 1 rupee more you have paid on how many hours? 58,000. So totally 58,000 you have paid more. It's an adverse variance. So add up everything. So here you get these two are adverse. So 18,000 plus 58,000. Total adverse is 76 minus 16,500 favorable. Net off you get 59,500 rupees. This is going to be what? This is going to be your labor rate variance. Clear with this, guys? Next one. Labor efficiency variance. How much is that going to be? How will you calculate? Standard hours minus actual hours worked into standard rate. So literally, I will compare this column, standard hours. I will compare this with actual hours worked. You were allowed to take this time, but you actually took only so much. I'm judging the efficiency into standard rate. That's about it. Clear with this, guys? So respective figure, this column, standard hours minus actual hours worked, 17,500, 32,300 and 57,200. We only take this actual hours worked, clear with this, into standard rate 6, 4 and 3. You can just take it up and you will arrive at this figure, right? I'm not getting into the calculation once again. So this is the amount you get. Clear with this, guys? Are you all able to understand? And finally, you have your labor idle time variance. What is that? Idle time into standard rate. Simple. So take this column, 500, 700, 800, multiply that with the standard rate. Look at this, 500, 700, 800, multiply with the standard rate, you will arrive at the figures. This is always an adverse variance, 8,200. Clear with this, guys? Right? So now what do you do here? Basically, you should understand efficiency variance is what? Here you have, this is actual hours worked. Please have this in your mind. So now, guys, ideally, always you should do the checking. So rate variance plus efficiency variance plus idle time variance should give you your labor cost variance. So 59,500 adverse plus 15,800 adverse plus 8,200 adverse, you get 83,500, right? So 83,500 adverse, it matches. Now, guys, I'm just summing it up here, and from here we will do that the gang yield variance and your mix and yield variance. We will be doing it, right? 1 second, I will just summarize this here. So labor cost variance, how much was the labor cost variance? It was 83,500, right? 83,500 favorable, sorry, adverse, right? Now this is bifurcated into two. What and what? Labor rate variance and labor efficiency variance. How much is my labor rate variance? We calculated it was 59,500 adverse. And how much was my efficiency variance? My efficiency variance was 15,800 adverse, right? And in between you have your labor idle time variance. So it is going to be how much? 8,200 adverse. 8,200 adverse. Now, guys, your efficiency variance is further classified into two. What and what? Labor mix variance, also known as labor gang variance. Mix or gang. Why gang? Gang means a group of people. So here you have multiple skill set of people. Labor mix variance or gang variance and labor yield variance. It's also known as sub-efficiency variance. Formulas, same formulas guys. So here labor mix variance. What is going to be the formula? Come on, revised actual hours minus actual hours into standard rate. Clear with this guys? And here it's going to be what? The other way around, right? Actual hours, sorry, it's going to be standard hours minus revised actual hours into standard rate. That's about it. But please understand one thing here, actual hours stands only for actual hours worked. Why? Look, under efficiency variance only these two variances come. So in efficiency variance, right, what do we calculate? It is going to be standard hours minus actual hours worked only, right? Obviously, so these two are these two are actually offroots of efficiency only. So wherever you find actual hours, it is always actual hours worked only. Are you guys clear with this? So there's absolutely no second thoughts about that. Now with this, let's go and quickly wrap this off also. Now guys, now I'm just going here and now taking this table. I'm just taking this table, okay? So now, what is going to be my actual hours worked? So this is the table that we are bothered about. So actual hours worked. So let me just take this table. 1 second. Right. So now, here, I'm just using this table once again. So first, let me come up with a template. Skill set, right? Or in other words, you can say the type of workforce, type of labor, then revised actual hours worked, standard rate, and labor mix variance. Now, what is the type of workforce? Skilled, semi-skilled, unskilled. This is what you have here, right? Now, first, which column will you fill? Actual hours worked. How much is actual hours worked? 17,500, 32,300, then 57,200. What is the total? 1,07,000. Now, what will you do here? This figure, you will plug it here. 1,07,000. Now, here I am taking the actual hours, but I am revising it for the standard mix. Sir, what is a standard mix, sir? Go to the question. Now, clearly they have given, look, out of 10 hours, right? This is standard data. 2 hours should come from skilled labor, 3 hours should come from semi-skilled labor, and 5 hours should come from unskilled labor. Or in other words, 2 by 10 of the total hours should be your skilled labor, 20%. 30% of the total time should come from semi-skilled, 50% should come from your unskilled, correct? Now what you will do, simple. So 2 by 10 into 1,70,000, 1,07,000 will be the revised actual hours for skilled. Similarly, 3 by 10 of your 3 by 10 into 1,07,000 will be semi-skilled, and your 5 by 10 into 1,07,000 is going to be your unskilled. So how much? 1,07,000 into 2 by 10, that's going to be 21,400. Then 3 by 10, it's going to be 32,100, and 5 by 10, it's going to be 53,500. Clear with this, guys, right? Now, what's going to be the standard rate here? The standard rate, it's available in the question 6, 4, and 3, right? This is going to be our standard rate. Perfect. So now go and calculate your labor mix variance. So now labor mix variance, how much is it going to be? So you were allowed to take 21,400. You've taken 17,500. So 21,400 minus 17,500. It's you saved 3,900 hours into 6. How much is it going to be? So 23,400 rupees favorable. Similarly, you could have taken 32,100. You've taken 32,300. So 200 hours you've taken more into 4 gives you how much? 800 adverse. Next, you could have taken 53,500. You've taken 57,200. So 53,500 minus 57,200 is 3,700 hours. You've taken more into 3. It's going to be 11,100 adverse. So now if you net this off, how much will you get? So 23,400 minus 800 minus 11,100. You get 11,500 rupees of hot favorable variance. What happened here? Literally guys, skilled skilled labor is the most costliest labor, semi-skilled little lesser costly, and unskilled it is the least costliest. Now what I have done, skilled labor I should have taken 21,400 hours, but I've taken only 17,400 hours, which means I have used less time of a costly workforce. That's why I got a favorable variance here. And I have more time of a cheaper workforce. That is the reason why I have a favorable variance. Why favorable variance? I took more time of a cheaper workforce, less time of a costlier workforce. I actually changed the mix. Because of that, I ended up getting 11,500 rupees favorable variance. You tell me, is this because of efficiency? No, it is because of changing the mix of the gang. Are you guys clear with this? Now let's go on to the next one, which is labor yield variance. Now labor yield variance is going to be standard hours minus revised actual hours into standard rate. Now quickly let's complete this also, and then the sum will be over. So here we have skilled, semi-skilled and unskilled. So standard hours minus revised actual hours into standard rate, right? Now let's do this quickly. So what's my standard hours? So it's already there, we've done this. Standard hours is going to be 20,000, 30,000 and 50,000. It's going to be 20,000, 30,000 and 50,000 minus what's my revised actual hours? The revised actual hours, just now we computed, it's 21,400, 32,100 and 53,500, right? So now let's do this. So 21,400, then you have 32,100 and 53,500. All the figures are available, nothing needs to be computed now, into standard rate 6, 4 and 3. Come on guys, so 20,000 you were allowed to take, but you've actually taken 21,400. So 1,400 into 6, it's going to be how much? It's going to be 8,400 adverse. This is the extra cost you have actually incurred, right? Next one. So you would have taken 30,000, but you've taken 32,100, 2,100 hours extra into 4. It's going to be 8,400 once again adverse. Then here 50,000 you have taken, 53,500 you have actually taken. So 3,500 into 3, it's going to be 10,500 once again adverse, right? So now if you add this up, you get how much? So 10,500 plus 8,400 plus 8,400, you get 27,300. What is it going to be? Adverse variance. Now guys, that's all it is. So your labor mix variance or the gang variance was 11,500 favorable, and here you have an yield variance of 27,300 adverse. So 27,300 minus 11,500, 15,500 rupees adverse is going to be your labor efficiency variance, and hence our computation is correct. Clear with this guys? This is all it is. Now literally, why did you have a mix variance, right? The mix of the gang variance you had, because simple, it was a favorable variance. Why? Skilled was the most costliest source of your labor, right? What happened? We consumed, or we actually incurred less time from a costlier labor source, and we took more time in a cheaper source of labor. Because of this mix difference, actually we had a variance to the extent of 11,500 rupees we could save. And actually if you see, because of efficiency, these guys were inefficient. So labor yield variance is clearly proved that they've got 27,300 rupees adverse is the variance attributable to your labor yield variance. Clear with this guys? So with this, we have completed this full question. This is the maximum complication you can have this in labor variance. You have labor variance with the multiple skill set, that too with idle time and all. That's about it. So please go and update your library of adjustments right out. Labor cost variance hyphen mix of skill set within bracket with idle time. Labor cost variance hyphen mix of skill set within bracket with idle time. This is the most comprehensive question in your labor variances, right guys? So with this, your labor related variance is also over. Now, ideally, your CMA Intermediate Paper 8 students, if you are a student attempting CMA Intermediate Paper 8, literally in this chapter, you have only material and labor cost variances. The remaining are not applicable for you. Clear with this, guys? So, CMA Intermediate Paper 8 students, only material and labor cost variances are applicable. And literally, we have covered in depth all the concepts, everything we have revised with the numerical problems itself. So, with that, we have completed our labor related variances. Let's move on to the next segment of discussion. Variable overhead cost variances. So that's the next segment, which is part 3 of this particular chapter. Variable overhead cost variances. Very, very simple. All the formulas that we're going to see here are exactly the same as your labor related variances. So variable overhead cost variance, what is the formula? Standard hours into standard rate, that is the standard variable overhead minus actual variable overhead, which is actual hours into actual rate. Right now, this is bifurcated into two. Variable overhead expenditure variance. There in labor we saw this was a rate variance. Here we don't call it as a rate. Here it is expenditure variance, and on the other side we have variable overhead efficiency variance. Now guys, variable overhead, an example of variable overhead is your power cost, right? Your power bill, electricity bill. Now, let us say, right? So a company has to incur, let us say your power cost is incurred as and when you run the machine, correct? Now, standard hours, right? For my actual production, I should have taken so many number of hours, and every hour, let us say I was supposed to pay a power cost of 10 rupees, right? So this is standard hours into standard rate. But actually what happened, actual hours, my machines ran for so many number of hours, right? Into actual rate at which I am paying the electricity department. Clear with this, guys? Now, this is bifurcated into two: expenditure variance and efficiency variance. Expenditure variance. Now, this is the responsibility of the maintenance department. With respect to the maintenance department, now the company will actually tell them, look, for every hour, you have to negotiate, talk with the electricity board or the electricity department, right? And make sure that for every hour that we are running the machines, right, the rate that you are supposed to pay is only 10 rupees, right? But actually, let us say, these guys, our maintenance team, they were not that good in negotiation. They ended up striking a deal for 12 rupees per hour. Now, before that, first, sir, here electricity, power bill and all, we only generally pay what the government asks us to. No, sir. Then how can these guys negotiate? No, for us, what we have is a domestic connection, electricity connection. In factories, they have industrial connection where there are certain things where they can go and liaison and maybe they can negotiate a deal with the department. That's how it works out. Now, what is the responsible for the maintenance guy? The rate. So obviously within the bracket, standard rate minus actual rate into actual hours. Why? Because the hours are not in his control. For how many hours the machines are being run. Clear with this, guys, right? So for those many hours, the maintenance team is responsible for the rate. So here the formula is standard rate minus actual rate into actual hours, where on the other side it is variable overhead efficiency variance. Whose responsibility? Production department responsibility. So here what do you have? Standard hours minus actual hours into standard rate. Why do I take standard rate here and not actual? If I take the actual, then I'm passing on the efficiency or inefficiency of the maintenance department to the production department, which should not be done. Hence we use standard rate. Are you guys clear with this? That's about this area. That's about this area. Exactly the same formulas as compared to labor. And in fact here, the efficiency variance is not further subclassified into mix and yield and all. Absolutely not there, because you can't have different types of power and all these things. Absolutely not. So it stops here, as simple as that. Now here, if you notice, one very important thing, always remember actual hours in this entire calculation of variable overhead variances. Actual hours is always actual hours worked. You don't have actual hours paid, actual hours worked separately. Actual hours means actual hours worked for the purpose of variable overhead variances. Why, sir? Simple. Only for those many number of hours for which my workers are working, right? My machines will be parallelly running, right? Suppose idle times, power cut, how will my machines run? So actual hours means actual hours worked only. Only for the actual hours worked, my machines will be running, and only for the machine hours that is being run, I will incur the power cost. Are you guys clear with this? And that's about the story of variable overhead variance. Quickly, let's go and do one numerical problem in this regard. Now, please take once again your solved question bank of your CA intermediate, right? Please take question number 9. Fairly decent question. This one is a fairly decent question. So let's quickly go and do this. From the following information of G Limited, calculate the variable overhead cost variance, the variable overhead expenditure variance, and the variable overhead efficiency variance. Okay, fine. All the variable overhead variances they are asking. Budgeted production is 6,000 units. The budgeted variable overhead is 1,20,000. The standard time required for 1 unit of output is going to be 2 hours. And the actual production is going to be 5,900 units. Actual overheads incurred is 1,22,000. Actual hours worked is going to be 11,600, right? These are the data given. With the help of this, we need to do what? We need to arrive at all the variable overhead variances. Fairly a direct and a simple question. Let's quickly get started with this. So this is going to be question number 9 in your variable overhead variances. So question number 9. Okay, so now first we only need 4 ingredients. What are they? Standard hours, standard rate, actual hours, and actual rate. And always remember, for the purpose of variable overheads, actual hour represents actual hours worked. Now, standard hours, please have the question with you. So what is my standard hours? Actual production. So I have produced how many units? I've actually produced 5,900 units, and for each of these 5,900 units, I should have taken how many hours? 2 hours. So 5,900 into 2 is going to be my standard hours. So 5,900 units into each unit I was supposed to take 2 hours. So 5,900 into 2 gives me 11,800 hours. It's going to be my standard hours. I should have taken a total of 11,800 hours. Now, what is going to be my standard rate per hour? Now, look at this. Now, what's my budgeted variable overheads? 1,20,000. Right? Now, the standard rate per hour means what? Budgeted overheads, right? Variable overheads divided by budgeted hours. Correct? Right? Now, what was my budgeted variable overheads? 1,20,000. What was my budgeted hours? They have given budgeted production is going to be how much? 6,000 units. Every unit, the standard time allowed is 2 hours, which means the budgeted hours would have been how much? 6,000 into 2, 12,000 hours. Guys, are you clear with this? So literally, the standard rate of variable overhead per hour is going to be 1,20,000 divided by 12,000. How did we get 12,000 hours? Budgeted hours 6,000 units into 2 hours each. Are you guys clear with this? So here it's going to be 1,20,000 divided by 6,000 units. Each unit can take 2 hours, which means the budgeted hours are going to be 12,000 hours. So 1,20,000 divided by 12,000 is going to be 10 rupees per hour. Are you guys clear with this? So it's going to be rupees 10 per hour. How did we get? If you want, you can put the calculation. Rupees 1,20,000 divided by 12,000 hours. Clear with this? It just requires some little bit presence of mind, and that's about it. Next one. Actual hours. Actual hours, they've actually worked for how many hours? 11,600 hours. And what is the actual rate? So the actual variable overhead incurred is given 1,22,000. So this divided by actual hours worked, you will get the actual rate, right? So 1,22,000 divided by 11,600. So it's going to be 1,22,000 divided by 11,600 hours. So it's going to be how much? 122,000 divided by 11,600. You get roughly 10.51724. It just keeps on running. You should retain the decimals in your calculator. As simple as that. So now what do? We can just go ahead and actually prepare this variable overhead cost variance. So first one, your variable overhead cost variance is going to be what? Standard hours into standard rate minus actual hours into actual rate. So standard hours 11,800 into standard rate 10. This is the cost you should have incurred. Whereas, what is the cost you've actually incurred? 11,600 hours into 10.5172 something. It keeps on running. Retain the decimals in your calculator. So the standard variable overhead cost is going to be 11,800 into 10. So it's 1,18,000. Whereas the actual overheads incurred was 4,600 into 10.5172 something. So it comes out to, we anyways have the actual overhead figure. It's 1,22,000. So which means you should have incurred a variable overhead of 1,18,000, but you've actually incurred 1,22,000. So the difference between that, how much is it? 4,000 rupees adverse is the variance here. Are you guys clear with this? So that's about the variable overhead cost variance. Now this should be classified into two. What and what? Variable overhead expenditure variance and variable overhead efficiency variance. Right? So now variable overhead expenditure variance, we know the formula. It's going to be standard rate minus actual rate into actual hours, and efficiency variance, standard hours minus actual hours into standard rate. Nothing needs to be mucked up. Even the formulas, logic, we are discussing in the marathon itself. So now come back. So what's going to be my standard rate, guys? So standard rate is given 10 rupees you are supposed to incur, but you have incurred actually how much? 10.5172. Please retain all the decimals in your calculator into actual hours, where 11,600 hours. So now 10 minus 10.5172 something, right, into 11,600, you get how much? 5,999.999, or in other words, it's going to be 6,000 rupees, obviously adverse, because you've actually incurred more than what you're supposed to incur. It's an adverse variance. Clear with this, guys? And how about your efficiency? You were supposed to take 11,800 hours, but you've actually taken only 11,600 hours. So you've saved 200 hours of the company into standard rate of 10. So 200 into 10, that's going to be 2,000 favorable. Clear with this, guys? Yes. So now your expenditure variance is 6,000 adverse, your efficiency variance is 2,000 favorable. So if you net off, you get 4,000 adverse. That's going to be your variable overhead cost variance. So now clearly we know that our maintenance team is not doing a good job, 6,000 adverse, whereas our production team is doing a very good job. They are super efficient. That's why 2,000 favorable. Net off, you have 4,000 adverse. Are you guys clear with this? And that's about the concept of variable overhead cost variances. That's about it, right? That's why I said it's the power of conceptual learning. If you complete your labor, automatically variable overheads is also done and sorted. Please go and update your library of adjustments. Write down variable overhead cost variance hyphen direct computation. Variable overhead cost variance hyphen direct computation. Right? And that's about the concept of variable overhead cost variances. Now, let's move on to the next segment of discussion, which is part 4, fixed overhead variances. Now, guys, one very important thing that you need to have in your mind, fixed overhead variance is a separate animal altogether, because it has nothing to do with the previous 3 variances. The previous 3 variances were similar in all aspects, whereas fixed overhead is separate altogether. Sir, why, sir? Now, let us say I budgeted to incur 1 lakh rupees of fixed overheads, and I budgeted to sell, or my budgeted output was 10,000 units. Whereas actually I ended up incurring 96,000 rupees of fixed overheads, and my actual output was 8,000 units. Now think and answer. You guys tell me, can I compare this 1 lakh rupees with 96,000 rupees as such? The answer is yes. Sir, just now you said it was not correct, right? So maybe some time back we understood the concept of standard cost and all, where you said, sir, this cost is pertaining for a different output level, whereas this cost is pertaining for 8,000 units level. So which means they are not comparable as such. Arrive at the standard cost, and that should only be compared with actuals. But here you are saying directly the budget can be compared with actuals. Wait, those concepts applied for all components of cost which are variable in nature, be it your material, labor, variable overhead. But fixed overheads, you logically think and answer. Fixed overheads means what? It is a cost which is incurred irrespective of your volume of output. Or in other words, guys, let us say factory rent. You were supposed to pay a factory rent of 1 lakh rupees, but you ended up paying 96,000. Here, this output is not relevant, because irrespective of my output, right, the fixed cost is not going to change. Or in other words, when it comes to fixed overheads alone, the budget can be directly compared with the actual, because your fixed cost has nothing to do with your output. Are you guys clear with this? Or in other words, there is no concept of standard when it comes to fixed overheads. So the concept of standards applies only with respect to all the variable components of cost, namely your material, labor and variable overhead. First of all, this is something that you need to remember. Now, given the fact, which means, sir, can I say 1 lakh rupees is the cost you should have incurred? Yes, correct. Budgeted overheads, fixed overheads itself is the cost you were supposed to incur, but you have ended up paying only 96,000, which means you have saved 4,000 rupees of fixed overheads for the company. Are you guys clear with this? Or in other words, the first thing that you need to understand when it comes to fixed overheads is that there is no concept of standard. Now, coming to your formulas and all these different types of fixed overhead variance. First of all, please consider this separately. Do not think that here we are comparing the standard fixed overhead with actual. No, there is no concept of standard first of all. Now, fixed overhead cost variance. What is the formula? Absorbed fixed overheads minus actual fixed overheads. Now, clearly if you notice, here they are comparing what with what? Absorbed with actual, or in other words, simply put, fixed overhead cost variance is nothing but calculation of under absorption or over absorption. Are you guys clear with this? Because here in fixed overhead variance, we are not computing how much is the fixed overhead cost you should have incurred. We are not comparing that with the actual fixed cost incurred. We are comparing how much was absorbed. Over fixed overheads absorbed is nothing but the overhead accounted, right, minus your actual fixed overheads. Clear with this, guys? Right? Now, for you to understand this, obviously you should have studied your overheads chapter. Only then the concept of absorption costing you will be able to understand it. Anyways, guys, right? So here, absorbed fixed overheads minus actual fixed overheads. Sir, absorbed fixed overheads, how can we calculate? Simple. Standard hours into standard rate per hour. Clear with this, guys? That is the predetermined rate. Clear with this, guys? Right? Or there's another formula also, right? Standard rate per unit into actual output. If you recall the discussion in your overheads, right? So what we use is predetermined rate per unit, right? That we multiply directly with actual units produced. If you do that, you arrive at what? The absorbed overheads. It's completely a subject matter of discussion in your overheads chapter. Or you can, if you want to go everything based on hours, standard hours into standard rate per hour. Clear with this, guys? Right? The next one. So absorbed overheads minus actual overheads is what your fixed overhead cost variance computes. So this is not like your other variable components of overheads. Now this is classified into two. One is called as expenditure variance. The other one is called as volume variance. Clear with this, guys? Very simple. Overheads expenditure variance, what does it calculate? Budgeted fixed overheads minus actual fixed overheads. Clear with this, guys? So here what we compute, what is the fixed overhead cost you should have incurred, that is being compared with what is the fixed overheads you have actually incurred. Are you guys clear with this? Or in other words, very simple, very simple. Now if you look at it here, now we have budgeted fixed overheads, we have actual fixed overheads, in between we have absorbed fixed overheads. My main fixed overhead cost variance calculates what with what? It computes the variance between absorbed with actuals. Clear with this, guys? Now this is bifurcated into two. I told you, expenditure variance and volume variance. Expenditure variance, what does it calculate? The difference between budget and actuals. Clear with this, guys? It compares what? Budget with actuals. But my topmost figure, it only computes the difference between absorbed with actuals. But on one side of the chart, expenditure variance computes the difference between budget with actuals, which means your volume variance should be the balancing figure. So absorbed minus budgeted. So it removes this variance. Are you guys clear with this? Look here. Once again, I am repeating. So here, your fixed overhead cost variance, the topmost figure, it computes the difference between what and what. So you have budgeted, we have absorbed, we have actuals, right? Here fixed overhead cost variance compares the difference between absorbed and actuals, right? On one side of the chart you have expenditure variance, which compares budget with actuals, budgeted overheads minus actual fixed overheads. And on the other side, balancing figure is your volume variance. It compares the difference between absorbed fixed overheads minus budgeted fixed overheads. So literally this is removed. So from this, basically, guys, so budget minus actual is your expenditure variance. Volume variance is absorbed fixed overheads minus budgeted fixed overheads. So literally if you add the two, you should get the top figure. Literally if you see here, so this budget minus budget fixed overheads gets cancelled here. Literally it becomes what? Absorbed fixed overheads minus actual fixed overheads. That's what you wanted on the top. Are you guys clear with this? So literally fixed overheads expenditure variance calculates what? Your budgeted fixed overheads minus actual fixed overheads, and your volume variance calculates what? The balancing figure, absorbed fixed overheads minus your budgeted fixed overheads. Are you guys clear with this? So you can remember this as a balancing figure. So there is no direct logic. Yes, there is logic only. It is absolutely logical, but it's not direct logic. Here if you see here, literally guys, absorbed overheads is absorbed for the actual volume, guys, correct? Whereas budgeted fixed overheads is pertaining to your budget volume. Because of the volume difference, how much is the variance is what we are computing. All these things happen because of the concept of using predetermined rate of absorption, which is a purely subject matter of discussion in your overheads chapter. Clear with this, guys? That's why this fixed overhead variance is completely a different manner of computing. It's not as direct as your other three variable components of your cost variances. Clear with this, guys? So simply put, first one, fixed overhead cost variance, under or absorption, absorbed overheads minus actual overheads, bifurcated into two, expenditure variance and volume variance. Expenditure variance, budgeted fixed overheads minus actual fixed overheads. How much you should have incurred, compare that with how much you have actually incurred. And fixed overheads volume variance, the balancing figure, absorbed fixed overheads minus budgeted fixed overheads. Are you guys clear with this? That's about it. Now, volume variance is further classified into two: fixed overhead capacity variance and fixed overheads efficiency variance. Clear with this, guys? Now, fixed overheads capacity variance, how do we calculate? Now guys, one thing alone. Now I want you to remember here, if you see absorbed fixed overheads, how will you compute absorbed fixed overheads? Yeah, it's going to be standard hours into standard rate per hour. That's how we compute this, right? It's going to be standard hours into standard rate, obviously per hour. Correct? This is your absorbed fixed overheads computation. Correct? Now here if you see fixed overhead capacity variance, only one thing is new here: actual hours into standard rate per hour. This actual hours alone I want you to remember. Sir, is it not logical? It is fully logical only. But if I start explaining the logic right now, it will take so many other, I will have to take the explanation of so many other areas which are not a subject matter of your CA or CMA intermediate level. That is the reason why I'm not getting too technical here. One thing alone, let us accept: actual hours into standard rate per hour minus whatever is your budgeted fixed overheads. That's all. Clear with this, guys? And efficiency variance is going to be the balancing figure. So absorbed fixed overheads minus AH into SR, right? Only if I do this, what happens? AH into SR gets cancelled, right? And I get absorbed fixed overheads minus budgeted fixed overheads. Are you guys clear with this? Once again, I'm repeating: fixed overheads capacity variance. What is the formula? One thing alone I asked you to remember. In the entire subject, this is the only place where I ask you to remember something: actual hours into standard rate per hour minus whatever is here, budget fixed overheads. And your efficiency variance is the balancing figure: absorbed fixed overheads minus AH into SR. Only if I do this, this gets knocked off, right? And I get absorbed fixed overheads on the top minus budgeted fixed overheads on the top. Clear with this, guys? And that's about the concept of fixed overhead cost variance. Now, actually seeing there is one more variance called calendar variance. Now, what happens in case of calendar variance? Separately, I will teach you with the help of a numerical example. But as of now, this is the base for you to compute. First, guys, once again, I'm summarizing. Many students struggle in fixed overhead variances. That's why I'm just repeating this again and again. Fixed overhead cost variance. First of all, understand there is no concept of standard in fixed overheads. So fixed overhead cost variance is nothing but a computation of under or over absorption. So what do you have here? Absorbed overheads is compared with actual overheads, bifurcated into two: expenditure variance and volume variance. Expenditure variance compares what and what? Budgeted fixed overheads with actual fixed overheads, right? Budget with actuals, right? On the other side, volume variance, absorbed is compared with budgeted. Clear with this, guys? Only if I do that, budget gets cancelled, and on the top I get absorbed fixed overheads minus actual fixed overheads. Are you guys clear with this? Now, the sum total of these two should be equal to your top figure, your daddy, right? This is daddy and these are two kids. So sum total of these two kids should be equal to your daddy. Right, once again, so now fixed overhead volume variance is bifurcated into two: fixed overheads capacity and fixed overheads efficiency variance. Capacity variance, one thing alone I asked you to remember: actual hours into standard rate minus budgeted fixed overheads. And on the other hand, efficiency variance, balancing figure, absorbed fixed overheads minus AH into SR. Clear with this, guys, right? And absorbed fixed overheads, how will you compute? Standard hours into standard rate per hour, or if you want to use units, predetermined rate per unit, that is standard rate per unit into actual output. These are two different ways of computing your absorbed fixed overheads. Ideally, this is covered in your overheads area. Clear with this, guys? Now, with this backdrop, let us go and do one numerical problem. With the help of that numerical problem, every single thing in this particular area will be covered. Clear with this, guys? Fine. Let's get started. Now, once again, please take question number 10 of your CA Intermediate solved question bank. Please take question number 10. Now, this question you please take. Now, to solve this question, first, guys, once again, any sum that you want to solve in your fixed overhead variance. Now, first you list out the ingredients. Sir, what all do I need? I need to compute absorbed fixed overheads. For you to compute absorbed fixed overheads, you need to know standard hours. You should know standard rate per hour. Then you should know actual fixed overheads. Then what else should you know? Budgeted fixed overheads you should know. Then all these data are done. And then one more thing, actual hours you should know. 5 ingredients if you know, this entire fixed overhead variance you will be able to crack. What are all the 5 ingredients? Standard hours, standard rate per hour, then actual fixed overheads, then budgeted fixed overheads, then you have actual hours. That's about it. 5 ingredients first you find out. Once you find these figures out, plug it in the respective column or plug it in the respective formula, you'll get the answer. As simple as that. Logically remember everything, guys. There is absolutely no pain in mugging up anything. So now let's get started here. So it's going to be question number 10. The cost details of J&G Limited for the month of September 20X1 are as follows. So the data is given, budgeted and actuals. Fixed overheads, budgeted figure, fixed overheads is 15 lakhs. Actual fixed overheads is how much? 15 lakh 60,000. Next one. The units produced, budgeted units is going to be 7,500. Actual units is going to be 7,800. Standard time for one unit, you are allowed to take 2 hours. Alright, it's not applicable in actuals. But actual hours worked was how much? 16,000 hours is the actual hours required. Calculate all the variances. Now, guys, quickly. We need only 5 ingredients. What are they? Standard hours, standard rate, obviously per hour. Then we need actual fixed overheads. Then we need budgeted fixed overheads. And finally, we also need actual hours. If we have these 5 ingredients, the entire fixed overhead cost variance can be computed. First, guys, standard hours. What do you mean by standard hours? For the actual production, what is the number of hours you should have taken? 7,800 units actually produced, and every unit you should have taken 2 hours. So 7,800 into 2, how much you get? 15,600 hours. Are you guys clear with this? Right? So 15,600 is going to be my standard hours. Clear with this? Next, what is going to be my standard rate? Standard rate means what? Right? So per hour, what is the fixed overhead budgeted rate? Simple. Budgeted rate is going to be budgeted fixed overheads divided by budgeted hours. So now, sir, how much is the budgeted hours? Budgeted units is going to be 7,500. Every unit you are allowed to take 2 hours, which means 7,500 into 2. This would have been my budgeted hours, which is 15,000. Clear with this, guys? So which is what is going to be a standard rate per hour? 15 lakh divided by 15,000 hours. Clear with this? So here I'll put it. So it's going to be 15 lakh rupees divided by 15,000 hours. How did you get 15,000 hours? 7,500 into 2. It's going to be 15,000 hours. So 15 lakh divided by 15,000 hours, it gives you how much? It gives you rupees 100 per hour. Are you guys clear with this? Next one. What is the actual fixed overheads? Actual fixed overheads we have 15 lakh 60,000. Next, budgeted fixed overheads. How much is it? Rupees 15 lakhs. Budgeted fixed overheads is how much? Rupees 15 lakhs. And what is the actual hours? It's going to be 16,000 hours. So now literally we have all the ingredients with us. So it is just a subject matter of plug and play. That's about it. Look at this. This is exactly what I have mentioned also. Standard hours we have computed. Right? The solution entirely is given here. Standard rate. Standard rate is nothing but budgeted fixed overheads 15 lakh divided by budgeted hours. What is the budgeted hours? Budgeted units into standard rate per hour. So we got 100 rupees per hour. Then actual fixed overheads is how much? 15,60,000. It's given. Budget fixed overheads 15 lakh given. Actual hours 16,000 hours given. With this, the entire thing we can now go and do it. Shall we get started? Yes. So this is question number 10. So I'm doing it here for you. Question number 10. So fixed overhead cost variance. What is going to be the formula? Formula is absorbed fixed overheads minus actual fixed overheads. Right? Now, what's my absorbed fixed overheads? Absorbed fixed overheads is going to be standard hours into standard rate per hour. Correct? Minus actual fixed overheads. Now guys, tell me what's going to be my standard hours. Just now we computed it was 15,600 hours into what's my standard rate per hour. We computed that as well. It's going to be 100 minus what's my actual fixed overheads is going to be 15,60,000 rupees. Clear with this, guys? Right? Just now we computed everything. Just now we computed everything. It was all mentioned here. We just now computed. So 15,600 into 100. This is my absorbed or fixed overheads minus actual fixed overheads comes out to 15,60,000. Right? So how much is this? 15,600 into 100. So absorbed fixed overheads is 15,60,000 minus actual is 15,60,000. So literally, guys, my absorbed fixed overheads is equal to actual fixed overheads. Or in other words, I don't have any under or over absorption. So literally, my fixed overhead cost variance is 0. It is neither adverse nor favorable because the absorbed is equal to actuals. Now, what do we do here? Now, this gets split into two. What and what? Fixed overhead expenditure variance and fixed overhead volume variance. Now, expenditure variance, what's the formula? Budgeted fixed overheads, what you should have incurred, minus actual fixed overheads. Come on, guys, tell me, what's my budgeted fixed overheads? It was given in the question, right? 15 lakh rupees is what I budgeted. Whereas, what's my actuals? My actual was 15,60,000. Or in other words, there is a 60,000 rupees of adverse variance. Alright, you were supposed to incur only 15 lakh, you've ended up incurring 15,60,000. Clear with this, guys? On the other hand, you have fixed overhead volume variance. What's the formula here? It's absorbed fixed overheads minus budgeted fixed overheads. So what's my absorbed fixed overheads? It was 15,60,000 minus what's my budgeted fixed overheads? That's going to be 15 lakh rupees. Sorry, that's going to be 15 lakh rupees. So how much is this? 60,000 favorable. Look at this, 60,000 adverse and 60,000 favorable. It gets knocked off and you end up having a 0 variance. Are you guys clear with this? Now, what happens here? This volume variance is further classified into two. What and what? Fixed overhead capacity variance and fixed overhead efficiency variance. Now, fixed overhead capacity variance. So guys, come on, tell me what's going to be the formula here. So capacity variance is this one alone. I asked you to remember actual hours into standard rate, right? Minus whatever is here, budgeted fixed overheads. Budgeted fixed overheads, right? Now, here efficiency variance balancing figure. Absorbed fixed overheads minus AH into SR. Now, come on, guys, tell me what's my actual hours. We have computed in this question. The actual hours was 16,000. So 16,000 hours into what's going to be my standard rate is going to be 100, right? Minus budgeted fixed overheads. We have budgeted fixed overheads of 15 lakh rupees. So AH into SR comes out to 16 lakh rupees minus 15 lakh comes out to 1 lakh rupees favorable. And on the other hand, we have fixed overheads efficiency variance. So it's absorbed minus AH into SR. So now tell me, guys, what's going to be my absorbed? 15,60,000 minus AH into SR. Just now we computed AH into SR comes out to 16 lakh rupees. So minus 16 lakh rupees. So how much you get? Here you have 40,000 rupees adverse. Clear with this, guys? Yes. So now literally 1 lakh favorable, 40,000 adverse, net off you have 60,000 rupees favorable as volume variance, and as simple as that. Literally guys, to crack the sum relating to fixed overhead variances, you only needed 5 ingredients: standard hours, right? You needed standard hours, standard rate, actual fixed overheads, budgeted fixed overheads, and actual hours. This is all you needed to crack this entire sum, and that's about this area, right? Literally, I've seen many students struggle in this area. This is all it is, and beautifully we've covered one comprehensive question in this area. So please go and update your library of adjustments, right? So write down. So fixed overhead cost variance hyphen fixed overhead cost variance hyphen direct computation within bracket without calendar variance, without calendar variance, which means we'll be doing one more sum which also covers calendar variance, and that's about this area. Fine guys, so direct computation within bracket without calendar variance, right? In our classroom discussion, right, in our batches, like the paid courses where regular or exam oriented batches, we'll be doing many variety of problems, but here for revision purpose, for conceptual revision purpose, I'm also doing numerical problem, one representative problem that is quite comprehensive and covers all the major areas. So this is a beautiful way to revise the entire subject. Clear with this guys? Now let's move on to the next concept where we have what happens in case of calendar variance. Sir, what do you mean by calendar variance? Wait, for that purpose, what we will do is, let's go to the next question. CA intermediate book only, your solved question bank. Please take question number 11. We will read this question, and with the help of this question, I will tell you what is the issue. We will understand calendar variance, and that's about it. With calendar variance as the maximum complexity you can have in this particular segment. So a company has a normal capacity of 120 machines working 8 hours per day of 28 days in a month. This is what generally the company works. 120 machines. Each machine will work for 8 hours a day, and like that there are 25 days a month. The fixed overheads are budgeted at 1,44,000 rupees per month. So this is the budgeted fixed overheads. The standard time required to manufacture 1 unit of a product is 4 hours. 1 unit is, you are allowed 4 hours. The month of April 2021, the company worked for 24 days of 840 machine hours per day and produced 5,305 units of output. The actual fixed overheads were 1,42,000. Compute all the variances. Now, in this question, there is one unique thing. What happened? In the budgeted data, the budgeted number of days in a month were how much? 25 working days. Whereas in the actual data, I have only 24 days in this particular month. Clear with this guys? So which means, look, in the budget, the number of days were different. In the actual, the number of days are different, which means the same period only, both were 1 month, but I was budgeting to have 25 working days, but actually I had only 24 working days. So because if the number of days in the budgeted period and the actual period are different, then you will have another variance called as calendar variance. Are you guys clear with this? Sir, in case of calendar variance, sir, what will happen? I will tell you. Now, you need to compute something called as, revised budgeted fixed overheads. Sir, what is the meaning of this? Simple. In this case, what was the budgeted fixed overheads? 1,44,000 for this month. Correct? Now, I budgeted to incur a fixed overheads of 1,44,000 per month, assuming that there are 25 working days. But let us say I have only 24 working days. In this case, what will be my revised budgeted fixed overhead? So why are we revising it? Because the number of days budgeted and the number of days which are actually worked are different. Clear with this guys? In this case, I will compute something called as revised budgeted fixed overheads. Clear with this guys? So how much is this going to be? Simple. 1,44,000 rupees is my budgeted fixed overheads for how many days? 25 days, but I'm actually having only 24 days. So how much will be my revised budgeted fixed overheads? 144,000 divided by 25 into 24, you get 1,38,240. It's going to be my revised budgeted fixed overheads. Are you guys clear with this? Now, sir, with this, what do we do? Now, simple. Now, my volume variance, fixed overheads cost variance is bifurcated into two: expenditure, volume. right? Till here, no difference. Now, volume variance is classified into two currently, capacity and efficiency. Now, if the number of days in the budgeted period and number of days in the actual period are not the same, in this case, in between you will have one more variance called as calendar variance. Are you guys clear with this? Sir, one more variance, sir. How do we compute? Very simple. Now, what do we do? Capacity variance, what is the formula? Actual hours, AH into standard rate per hour minus budgeted fixed overage, no? Right? Now, instead of budgeted fixed overage, what you need to do here, you should use revised budgeted fixed overage, the figure that we just computed. Clear with this, guys? Now, sir, how will it tally, sir? On the top, we have only budgeted fixed overage. If you use revised budgeted fixed overage, how will it tally? Wait. Now, immediately introduce something called as calendar variance. What will be the calendar variance? It will nullify revised budgeted fixed overheads minus budgeted fixed overheads. Are you guys clear with this? Now, literally, if you see here, the capacity variance, now what will be the formula? AH into SR, that will not change, minus revised budgeted fixed overheads. Instead of budgeted fixed overheads, what will we do now? Revised budgeted fixed overheads. Sir, it will not tally with the top figure. Wait, immediately introduce one more guy called calendar variance. What will calendar variance happen? Now, calendar variance, you have revised, what is the formula? Revised budgeted fixed overheads minus budgeted fixed overheads. If you do this, this and this gets knocked off. I introduce something and revised budgeted fixed overheads positive, revised budgeted fixed overheads negative gets knocked off. Literally what you get is AH into SR minus budgeted fixed overheads. Ideally, this is what you would have got. Clear with this, guys? We are segregating it into two. So instead of budgeted fixed overheads, in capacity variance, you subtract what? Revised budgeted fixed overheads. Immediately in calendar variance, revised budgeted fixed overheads minus budgeted fixed overheads you do. Efficiency variance, the formula will not change. It is the same balancing figure. Clear with this, guys? Or in other words, the capacity variance alone is split into two. Right now you have capacity variance using revised budgeted fixed overheads, and once again to nullify this, revised budgeted fixed overheads minus budgeted fixed overheads is what we need to do. So literally, if you have calendar variance, now there is one more sixth figure that you need to compute called as what? Your revised budgeted fixed overheads. So anyways, you need to compute standard hours, standard rate, actual fixed overheads, budgeted fixed overheads, then actual hours, and over and above this, now we also need to compute revised budgeted fixed overheads. Are you guys clear with this? If you have this in your mind, then 6 figures first you compute, then just plug the figures in the respective formula and you're sorted here, good to go. Clear with this, guys? Right? So now this is what the sum says. So now shall we first list out all the ingredients of this particular question? Let's do that first, and once we are done with that, this entire question will also be sorted. So what are all the ingredients that we need? Guys, revised budget fixed overheads, that is the 6th item that we need anyways. So we need standard hours, then standard rate per hour, then actual fixed overheads, then what do we need? Budgeted fixed overheads. Is that all? Then we also need one more thing. What is that? Actual hours. These are the 5 ingredients plus the 6th ingredient, revised budgeted fixed overheads, which we have computed. What do you mean by revised budgeted fixed overheads? So budgeted fixed overheads divided by budgeted number of days multiplied by actual number of days. If 1,44,000 was budgeted for 25 days, how much will it be for 24 days? Clear with this, guys? Now, what is going to be my standard hours? Come on, tell me, guys. Standard hours. So how do you compute your standard hours? What is the actual production? So 5,305 units. Now for each unit, you were supposed to take how many hours? 4 hours each, which means it's going to be 5,305 units into 4. How much is that? 5,305 into 4, that's going to be 21,220 hours. Clear with this, guys? Next one, standard rate. How much is the standard rate per hour? Standard rate per hour, budgeted fixed overheads divided by budgeted number of hours. Correct, guys? So now how many budgeted number of hours are there in my in my budgeted period? 1 second. So this is question number 11. I will also take the question with me, right? Just a minute. Okay, right. So now so it's going to be 120 hours, right? The normal capacity was 120 hours into 8 hours per day of 25 days in a month. So it's 120 into 8 into 25. So 24,000 hours were budgeted. Guys, clear with this? So here the budgeted hours were how much? 120 machines each machine is going to work for 8 hours a day, and like that 25 days a month is what I budgeted. So 120 into 8 into 25, how much is that? 24,000 hours were budgeted. And what was the budgeted fixed overheads? 1,44,000. So 1,44,000 divided by 24,000. Literally, the standard rate per hour is going to be 6 per hour. How did we get budgeted fixed overheads? 1,44,000 divided by budgeted hours, which was 24,000 hours. Clear with this, guys? Next one. What is my actual fixed overheads? Simple. Actual fixed overheads is 1,42,000. Right? Now, what's my budgeted fixed overheads? The budgeted fixed overheads is 1,44,000. And what is my actual hours? It's given in the question. Oh no, the company worked for 24 days of 840 machine hours per day. So it means 840 into 24. How much you get? 20,160 machine hours per day. Clear with, not per day, for this entire period of 1 month. Clear with this, guys? So now we got all the ingredients with us. So standard hours, standard rate, actual fixed overheads, budgeted fixed overheads, actual hours, and we also have the revised budgeted fixed overheads. Now it's just an issue of substituting the formula, substituting the figures at the required formula. Now look at this. So all these things I have given in the solved question back itself. First, total fixed overhead cost variance formula, absorbed fixed overheads minus actual fixed overheads. Absorbed is what? Standard hours into standard rate minus actual fixed overheads. Standard hours, how much was it? 21,200 into standard rate, 6 rupees, minus actual 1,42,000. If you do, you get the calculation as how much? 14,680 adverse, right? 14,680 adverse. The total fixed overhead cost variance, that's nothing but under or over absorption. Clear with this, guys? Now this is bifurcated into two, expenditure and volume. Expenditure variance, what is the formula? So your budgeted fixed overheads minus actual fixed overheads. What's your budgeted figure? 1,44,000. What's my actual figure? 1,42,000. All the ingredients are calculated above. Just to substitute. So 1,44,000 minus 1,42,000. 2,000 favorable is going to be your 2,000 favorable is going to be your expenditure variance. Now on the other side you have volume variance. What is the formula? Absorbed minus actuals. So what's your absorbed fixed overheads? Absorbed was 21,200 into 6, right? So 21,200 into 6 gives you how much? 1,27,000, right? So it was 1,27,000. 1 second. 21,200 into 6. It was 1,27,200. Correct? So it's 1,27,200. Just a minute. Yes. So ideally, your standard hours are 21 to 20, right? 21 to 20 hours. So now your absorbed fixed overheads is going to be 21 to 20 into 6. How much was that? 1,27,320, right? So that minus 1,42,000 will only give you 14,680. Correct. So now volume variance. What is the formula? Absorbed fixed overheads, which is 1,27,320 minus budgeted fixed overheads, which comes out to 1,44,000. So 127,320 minus 1,44,000 gives you how much? 16,680 adverse. Clear with this, guys? That's about it. So literally your expenditure plus volume variance. So this plus this should give you your overall fixed overhead cost variance. So can we check this? 2,000 favorable, 16,680 adverse. If you net it off, you get how much? 14,680 adverse. Correct? That is the figure that you get above. So obviously your calculation is correct. Now your fixed overhead volume variance is bifurcated into 3. What and what? Your fixed overhead calendar variance. Your fixed overhead capacity variance, fixed overhead calendar variance, and fixed overhead efficiency variance. 3 different variances are there. First one, capacity variance. What is the formula? AH into SR minus revised budgeted fixed overheads, right? So AH into SR. So what is your actual hours? Your actual hours are 20,160 hours into standard rate is 6 minus revised budgeted fixed overheads. We got it as 1,38,240. This is what we got here, 138,240, right? Here in a printed format, everything is given, nothing to worry about it. All right. So it's going to be, look at this, 20,160 into 6. So 20,160 into 6, it comes out to how much? 1,20,000. 1 second. 120,960, right? Minus your revised budgeted fixed overheads. So it's going to be 1,38,240. If you subtract this, you get how much? You get 17,280 adverse, right? Now the next one, calendar variance, revised budgeted fixed overheads, 1,38,240 minus budgeted fixed overheads. We have budgeted fixed overheads here, 1,44,000 minus 1,44,000. How much you get? 138,240 minus 144,000. How much is it? 5,760 adverse. And finally, you have efficiency variance. What is it? Absorbed fixed overheads minus AH into SR. So absorbed fixed overheads, we already calculated the figure, 127,320. 1,727,320 minus AH into SR. So AH into SR, we got it as 120,960, right? So 127,320 minus 120,960, you get how much? So 6,360 favorable. Clear with this, guys? So now just try to net off these three figures. So 17,280 adverse plus 5,760 adverse, you get 23,040 adverse minus 6,360. Since it is favorable, net it off, you get how much? 16,680 adverse. You get the top figure of your volume variance. Clear with this, guys? So literally with this, we have finished this entire fixed overhead cost variance with your calendar variance. This is one final variant in this particular concept of fixed overhead cost variance. It's as simple as that. So please go to your library of adjustments and update it. So write down, it's going to be fixed overhead cost variance hyphen fixed overhead cost variance hyphen direct computation within bracket with calendar variance. Direct computation within bracket with calendar variance. Clear with this, guys? So literally with this, we have finished all the four cost variances, right? We have completed your material cost variances, labor cost variances, variable overhead cost variances, and even fixed overhead cost variances with calendar variance, without calendar variance. Everything is completed. So with this, the syllabus for CA intermediate students is over, right? CMA intermediate students will have one more extra thing. The sales variants are also applicable, but for CA intermediate syllabus, you have only the four cost side variances. With this, we have completed all the four cost side variances with full revision of all the formulas with all the logics, and also we have done about we have done about 7 numerical problems till now. Right, till now itself we have done 7 numerical problems in the marathon itself. Anyways, during the courses, your exam oriented or regular courses, we do many more sums, but in a marathon to revise, I have handpicked some comprehensive questions to cover the entire chapter, and that's about this, right, guys? So with this, we have completed all the cost side variances. So now let's move on to the next one, which is sales side variances, which is applicable exclusively for CMA intermediate paper 12 management accounting students. So now let's get started with the revision of next chapter called as budget and budgetary control. Now, before I get started with this particular chapter, now once again, guys, this chapter is a common chapter in your CA intermediate paper 4 cost and management accounting, as well as in your CMA intermediate in paper 8 cost accounting. Exactly the same chapter is there, as well as in CMA Inter paper 12 management accounting, the same chapter is there. In CMA intermediate paper 12, if you notice, guys, right now there, this chapter is called forecasting, budgeting and budgetary control. Name alone they have added forecasting, but for that, right, exactly everything is going to be the same only. Clear with this? So once again, guys, this is a common chapter for your CA as well as CMA intermediate, right? In CMA intermediate, both the papers have this particular chapter. And now this marathon, in this marathon revision, right, I am having a common session for revising this particular budgetary control, right, for CA and CMA intermediate. However, in our regular and exam oriented batches, the recordings are all separately done for CA Inter, and even in CMA Inter paper 8, paper 12, separate recordings are done, and the books are all 3 different books for each of these 3 courses, right? We have our concept decoder and solve question bank separately for every single subject paper here. But since this is a revision marathon, I am having a common session across the courses for all the students, so that even those students who are actually appearing for CA and CMA, or maybe group 1 and group 2 of CMA, everyone, these guys can actually spend one session for a common topic. So that is the reason why I'm making this as a common recording. Clear with this, guys? Now On that note, let's get started with this particular chapter called budget and budgetary control. So please have this in mind. So in all our repeat courses, we have it as a separate recordings. It's not a combined recording of CA and CMA. Now, coming back here, right? Now, this chapter, budget and budgetary control, goes on to achieve two objectives: decision making and control. Two objectives. Overall, our subject has three objectives, right? So stock valuation, profit computation, decision making and control. Now, this particular chapter goes on to achieve the objective of decision making and control. Sir, how, sir? First of all, before that, what do you mean by a budget? Budget is basically a plan of action. Now, all of us do budgets in our everyday life. For example, let's say your exams are, your exams are going to happen, or your exams are going to be scheduled 2 months from now. Now, what do? You prepare a budget. Okay, so 2 months I have, right? So 2 into 30, overall I have 60 days. So per day, let us say I'm going to study for 10 hours. So 60 into 10, 600 hours I have, divided by the number of subjects. Per subject, what is the time I have? Basically, it's a plan of action. Similarly, before the start of every single period or a financial year, or maybe a particular month, as the case may be, the frequency could be different. Every company comes up with their own budget, right? Now, I told you this chapter budget goes on to achieve two objectives: decision making and control. Sir, how is that possible? Now, first we will see how budget goes on to achieve the objective of decision making. Now, let us say, guys, in the board meeting where the board of directors decide for the upcoming year, right? The board of directors have two choices, right? Now, they are planning to fix the selling price for their product, right? Let us say option number 1. They can fix the selling price at 10 rupees. If they fix the selling price at 10 rupees, they will be able to sell, let us say, 1 lakh units. Or option number 2, suppose instead of 10 rupees, if they reduce the selling price to 9 rupees, they will be able to sell, let us say, 1,10,000 units. Example, right? Obviously, if you reduce the selling price, the volume will increase. Now, what should be the ideal selling price the company should fix? 10 rupees or 9 rupees? Now, with this data, we can't decide, but what the company will do, if they fix the selling price at 10 rupees, they will arrive at the profit. If they fix the selling price as 9 rupees, they will arrive at the profit. Now, out of these two options, whichever will give the maximum profit for the company, they will go for that particular option. Or in other words, first, to fix a budget, a company has to choose between multiple alternatives. This way, it helps them to enable the objective of decision making. Let us say option 2 is more feasible because that gives them the maximum profit. Now, having chosen this option, now what they do, they set this as the target, right? And they inform the team that, look, this year we have to produce and sell 1,10,000 units. The selling price needs to be 9 rupees. Accordingly, they plan their cost, schedule their production and all these things. Now, they set this as the target, which needs to be followed by their team members, right? And this target is compared with the actuals, and now they are able to exercise control over their organization. Now, at the end of the period, they compare the performance which they should have done, the employee should have done, they compare that with the actual performance done by their employees, and they analyze for the variance or deviations, and accordingly they take any corrective actions, or maybe in case these guys have outperformed, they will reward them. This process helps them enable the objective of control. Or in other words, budget helps in two objectives: decision making as well as in the objective of control. And always remember, this is something that is done right before the start of a particular period. Clear with this, guys? Now, that's about a brief introduction to this particular chapter. Now, guys, in this particular chapter, broadly, there are two segments for discussion. Segment number 1 deals with preparation of functional budgets, and segment number 2 deals with preparation of flexible budget, right? Now, This part, functional budget, is kind of similar to cost sheet area, and this flexible budget, it is kind of similar to your concepts that you studied in marginal costing, right? So these are the two segments which we are going to learn in this particular chapter. Right, guys? Now, fairly a simple chapter. It's not big as well, and kind of it's very easy to score in this particular chapter. On that note, let's get started with the first segment of discussion called as functional budget. Now, what do you mean by a functional budget? Preparing a budget for every single function in the organization is called as a functional budget. Sir, what are the functions, sir? Sales, production, purchase, your material consumption, labor. So for every single function, right, if you are preparing a budget, it is called as functional budget. Now I'm just opening the concept decoder note of CA Inter, right? This is more or less whatever we study here is same as what we see in your CMA Inter paper 8, right, as well as in CMA Inter paper 12. Wait 1 second, I will open and show it to you. Right here you have this chapter, this is chapter number 16. 1 second. Yes, this is yes, chapter number 16. It's on page 169. I'll quickly open it up for you. Yes, look at this. More or less, everything is the same in terms of numerical problem, concepts covered. It's all exactly the same, guys, right? That is the reason why here, since it is a common topic, right, I am making a common discussion, but all our courses are recorded exclusively. Even in CMA Inter, paper 8 separate recording, paper 12 separate recording, because these are all different books that I've used. So obviously it is all one and the same. I mean, the recordings are completely different, but in a marathon when we are revising, right, I thought maybe it's easier for students to combine everything, right, because it's a common topic across all the courses. So obviously we can actually, it's easy to put it in one place, so that even if you are studying multiple courses, it will be easy for you to correlate. That's the reason why clearly I'm mentioning which concept is covered, or which chapter is available in which particular paper, and in what name it is actually being present in everything, right? Just give me a minute. I have this here. One second. Yes, look at this. Forecasting, budgeting, and budgetary control, right? So this is in your paper 12 concept decoder book. This is your paper 8 concept decoder book, chapter number 16, right? This is basically your CA Inter concept decoder book. There it's chapter 15, budget and budgetary control. Everywhere it is exactly the same, guys, right? So in fact, I will be doing a couple of numerical problems, and with that we will be revising this entire chapter beautifully. That's about it, right? And everything is conceptual here. Now guys, now the first one here, what are the different functional budgets? So preparing budget for every single function is called as a functional budget. Different functional budgets: your sales budget, production budget, plant utilization budget, direct material usage budget, direct material purchase budget, direct labor budget, your factory overheads, production cost, your closing inventory, cost of goods sold budget, selling and distribution budget, administration budget, R&D budget, capital expenditure budget, cash budget. These are all different variants of budget. What is every single budget? Theoretically, it's been explained, but practically, quickly, we will just be covering all these areas, right? So these are all the different varieties of functional budget. But remember one thing, practically, to solve numerical problems and all, the first budget that you should have is your sales budget. You should always prepare the sales budget first. Once you prepare the sales budget, the next budget you should prepare is your production budget. It has to be in the same order. Reason I will tell you, right, with a numerical example. So first you need to prepare sales budget. Then you need to prepare a production budget, and once these two budgets are, once production budget is available, then all other cost related budget can be prepared. Clear with this, guys? Sir, why is it that I need to maintain, or I need to prepare budgets in the same order? Now guys, always remember, sales is the starting point. Always remember, sales is a starting point. Now If you notice, right, in a factory, in an FG area, right, let us say I have an opening stock of FG, right? Then I have, let us say, for example, I have 1000 units of opening stock of FG, right? Guys, clear with this? Then let us say the closing stock of FG that I need to maintain is 2000 units. I'm just giving you guys an example, right? And let us say I am planning to sell, example, 10,000 units of FG, right? Now, in this upcoming year, first, the company is planning to sell 10,000 units, right? Now, sir, let us produce 10,000 units. Wait, they also want you to maintain a closing stock of 2000 units of FG, which means, sir, I have to sell 10,000 units of FG. Over and above that, I need to maintain at the end of the year a stock of how much? 2000 units of FG, which means totally, sir, I need to have how many units of FG with me? 12,000 units of FG with me. Sir, which means, should I produce 12,000 units of FG? Wait, now you need to have 12,000 units of FG, but already you have with you 1,000 units of FG, which means at present, in this current period, you are only required to produce how many units? The production is going to be how much? The balancing figure. So 12,000, right, minus 1,000, it is enough if you produce 11,000 units right now. Are you guys clear with this? Or in other words, for you to first arrive at the production budget, you first need how many units you are going to sell, right? Sales plus closing stock gives you the total requirement, right? From that, minus the opening stock which you already have, now you will be getting the figure which you need to produce in this particular period. Clear with this, guys? Or in other words, I can say sales plus closing stock minus opening stock gives me the production. In this case, I need to sell 10,000 units. On top of it, I need to have 2000 units as a closing stock, but wait, I already have with me 1000 units of opening stock, which means net off, I need to produce how many units? I need to produce only 11,000 units in this particular period. Are you guys clear with this? Right? So now, for me, first I need the sales budget. Using the sales budget only, I can arrive at the production budget. Clear with this, guys? And now once I have the production budget, now all other budgets I can prepare. For example, let us say, guys, 1 unit of FG requires 2 kgs of raw material. Now, with this, I can say totally how many kgs of raw material should I need? What is the total raw material consumption budget? Can I say raw material consumption is going to be, sir, for every unit of FG, I need 2 kgs of raw material, but in this year, I'm going to produce 11,000 units of FG, which means totally I need how many kgs of raw material? 11,000 into 2, I need a total of 22,000 kgs of raw material. Alright, so this is my raw material consumption budget. Clear with this, guys? Now, on top of it, the company wants to maintain a closing stock of raw material. Let us say the company wants to maintain a closing stock of 3,000 kgs of raw material, which means now I should have with me what? 22 kgs for the purpose of production I need to consume, plus 3,000 kgs I need to maintain, which means overall, so 25,000 kgs you need to purchase, right? But wait, minus I already have with me, let us say I already have with me 5,000 kgs of opening stock, which means totally I need 25,000, out of which already 5,000 is available in my opening stock, which means net of now I only need to purchase how much? I need to purchase 20,000 kgs of stock or raw material. Are you guys clear with this? This is called as raw material purchases budget. Are you guys clear with this? Let us say 1 kg of raw material is purchase rate of 10 rupees. So now this 20,000 kgs into 10 gives you 2 lakh rupees in value. Are you guys clear with this? So now the first point was sales budget. From the sales budget, we arrived at the production budget. Using the production budget, we could arrive at the raw material consumption budget. Using the raw material consumption budget, we could arrive at the raw material purchases budget. Clear with this, guys? Suppose, for example, right? 1 unit of FG requires 3 labor hours, which means what is the total labor requirement budget for you? 11,000 units into 3. I will say, sir, totally I need 33,000 labor hours in this particular period. Clear with this, guys? So using the production budget, now you can arrive at your labor requirement budget, and all other budgets will stem out of your production budget only. Are you guys able to understand? So always remember, the first budget you need to prepare is what? Sales budget. From the sales budget, production budget can be arrived. From the production budget, your raw material consumption budget, raw material purchases budget, your labor requirement budget, all other budgets you can prepare using the production budget. Are you guys clear with this? And that is all about, right, this particular concept of your functional budget. Now directly on this note, let's go and solve one numerical problem. That's about the first segment. So let's go and solve one numerical problem. Once again, guys, this is a common question for both CA and CMA students. So please take the first question, right, from your CA intermediate, solved question bank. Now do not think that, sir, CA question, sir, it is not applicable for me. Absolutely not. This question is equally applicable for CMA intermediate paper 8 cost accounting students as well as paper 12 management accounting students. I am just taking one sum so that it's a proper revision for you to complete this entire concept of functional budget. As simple as that. Don't think that it's not a part of your syllabus. It's applicable for everybody. Clear with this, guys? On this note, let's get started here. Now what have they given? Prepare a quantitative production, material usage means material consumption, and purchases budget from the following data of a particular month. Product A, product B. Budgeted sales quantity for each of the products is given. Material consumption per unit is given, right? So product A requires 2 kgs of material B and 1/8 kgs of material Q. Right? Similarly, product B requires 4 kgs of P and 1 kg of Q. Basically, guys, there are 2 different products and each of the product requires 2 different types of raw material. Right? Now, what have they given here? The stocks of the products and materials are as under. Product A and B. Guys, please be careful here. A and B are FG and material P and Q are raw material. Now, A and B, FG, they have given the opening stock and the closing stock, right? The figures are given. Raw material P and raw material Q, opening stocks are given, closing stock are not given. Read the question below. The company wishes to operate a JIT material inventory system. JIT means just in time, right? Which means they don't maintain much of stock, right? Whenever it is required, only then, when they get a customer order, only then they will purchase and they will keep the raw material, right? Now what is JIT is not required in this particular question. They themselves have given. As an initial procedure, it wishes to maintain a minimum stock of material equivalent to 2 days worth of consumption, right? Sir, whatever I am going to consume in 2 days, that will be the amount of closing stock for P and Q. Clear with this, guys? Now there are 28 working days in a month. Based on this, you can calculate what your closing stock. Basically, what we will do is monthly consumption divided by 28 into 2. If you do, you will arrive at your raw material P and raw material Q's closing stock values. Clear with this, guys? So now, what do we do about, how do we go about with this particular question? The first thing that we need to do here, guys, the first thing we need to do here is what? Using the sales, first we need to arrive at our production budget, correct? Once we arrive at the production budget, now what we can do is, based on the production budget, we can arrive at the raw material consumption budget, and then we can arrive at the raw material purchase budget and other things. Clear with this, guys? So on this note, let's get started here. First, guys, let's talk about these 2 output products, FG products, product A and product B. Now, what is the sales value here? Given 15,000, 17,500. Now, sales plus closing stock. How much is the closing stock? 1750, 3375. So 1750, 3375 minus opening stock. How much is the opening stock? 750 and 875. Reduce this, 750 and 875. Net of, so what is going to be, how many units of A should be produced? 15,000 plus 1750 minus 750. Literally you need to produce 16,000 units of A, and how many units of B? 17,500 plus 3375 minus 875 gives you 20,000 units of B. So first we arrived at the production budget. We calculate how many units of A and how many units of B needs to be produced. Are you clear with this? Now based on this we can prepare the material consumption budget in kgs. Now what are the two different types of raw material? Material P and material Q. First, material P and material Q. Now what happens here? Now first, product A. How many units of product A I'm going to manufacture? 16,000 units of product A I'm going to manufacture. And please have this in mind, to produce every unit of A I need 2 kgs of material P and 3 1/8 kgs of material Q. Clear with this, guys? So now 16,000 units of A require totally how many kgs of P? So 16,000 into 2, I need how much? 32,000 kgs of product P, raw material P. Are you guys clear with this? So for producing 16,000 units of A, right, every unit of A requires 2 kgs of raw material P. So 16,000 into 2, I need 32,000 kgs of P, plus every unit of A requires 3 1/8 kgs of what? Raw material Q. So simple, 3 1/8 is basically how much? So 1/8 is 0.125. So 3.125, right, kgs of Q is what I need. So every unit of A requires 3.125 kgs of, right, raw material Q. So here I will say it is 16,000 units into 3.125. How did you arrive at 3.125? 3 1/8. So 1/8 you do. How much you get? 0.125. So 3 plus 1/8. That is 3 plus 0.125, 3.125 kgs. So to produce 1 unit of A, I need 3.125 kgs of Q. So to produce 16,000 units of A, how many kgs of Q do I need? 3.125. So 16,000 into 3.125. Overall, I need 50,000 kgs of Q. Are you guys clear with this? Next one. How about B? How many units of B are we going to produce? So we are going to produce a total of 20,000 units of B, and every unit of B requires 4 kgs of P and 1 kgs of Q. Very simple. 20,000 into 4, 80,000 kgs of P, and 20,000 into 1, so that's going to be 20,000 kgs of Q. Clear with this, guys? So overall, how many kgs of P is required for consumption? 32,000 plus 80,000. It gives me a total of 1,12,000. And how many kgs of Q? 50,000 plus 20,000. It gives me a total of 70,000 kgs of Q. Are you guys clear with this? Or in other words, overall, the raw material consumption budget is going to be 1,12,000 kgs of P I'm going to consume in this particular month, and 70,000 kgs of Q I'm going to consume in the particular month. Clear with this, guys? So the upcoming month requires this particular consumption of P and Q. Clear with this, guys? Now, from this, we need to calculate the material purchases budget. How do you arrive at the material purchases budget? Simple, raw material consumption plus closing stock minus opening stock net off gives you your material purchases budget. As simple as that, right? Now, what do we do here? Simple, guys. First, raw material consumption. We know P 1,12,000 I need to consume. Perfect. And Q 70,000 I need to consume. Clear with this, guys? Perfect. Plus closing stock minus opening stock. Now in the question I have the opening stock figures, 12,000 kgs and 8,000 kgs. Very simple. This figure I can populate 12,000, 8,000 respectively. Consumption also we have. Now how will you compute the closing stock of raw material? Simple. In the question they have given, the company is planning to maintain minimum stock which is equivalent to 2 days worth of consumption. Right? Now let us take product P. Now product P, in a month I am planning to consume how many kgs? 1,12,000 kgs. So 1,12,000 kgs is for a period of 1 month, having how many days? 28 days. So if this is the consumption required for 28 days, How many kgs do I consume for 2 days? 1,12,000 divided by 28 into 2. Basically, I am going to consume 8,000 kgs for 2 days. So 2 days equivalent consumption is what I'm going to stock as my closing stock. Hence, 8,000 kgs is going to be my closing stock for raw material P. Are you guys clear with this? Right? This is a good adjustment in this question. Now, the other one for product Q. Again, 2 days equivalent stock. So 70,000 is the consumption required for 1 month having 28 days. How much will be the equivalent consumption for 2 days? 70,000 by 28 into 2. That gives you how much? 5,000 kgs. Are you guys clear with this? So 5,000 kgs is going to be my closing stock of raw material Q. So P has a closing stock of 8,000 and Q has a closing stock of 5,000. So now what do we do here? So what is going to be my total purchases, raw material purchases budget? Raw material consumption 1,12,000, right? So plus closing stock 8,000 minus opening stock of 12,000. So 1,12,000 plus 8,000 minus 12,000 gives you 1,08,000 is going to be the total number of kgs which I need to purchase in this particular period. And how about product Q? It's going to be 70,000 plus 5,000 kgs, right, of closing stock, right, minus 8,000. So 70,000 plus 5,000 minus 8,000 gives you 67,000 kgs I have to purchase raw material Q. Are you guys clear with this? This is going to be the raw material purchases budget in kgs. Now if I want to convert it into value, simple, every kg of P has a purchase price of 3 rupees and every kg of Q has a purchase price of 2 rupees. Multiply this respectively with 3 and 2. So 1,08,000 into 3 gives you 3,24,000 and 67,000 into 2 gives you how much? 1,34,000. Clear with this, guys? So this is going to be the raw material purchase budget in value and this is going to be raw material purchases budget in kgs. Clear with this, guys? So this is the purchase budget in kgs and this is going to be the purchase budget in value. Are you guys able to understand? As simple as that. So first what you need to do, sales data is that sales plus closing stock of FG minus opening stock of FG gives you production. So production, right, into the number of kgs required per unit, you arrive at the consumption budget. Now consumption, raw material consumption plus closing stock, this is ideally plus closing stock minus opening stock gives you your raw material purchases in kgs. Multiply that with the rate, you will arrive at the raw material kgs to be purchased, the purchases budget in value. As simple as that, guys. Very, very simple and straightforward, provided you have this particular line of thinking. That's all it is. That's all it is. Clear with this, guys? This is all we need to do in this particular area of functional budget. Clear with this, guys? So with this, we have completed this particular question. So let's go and update our library of adjustments. So write down functional budget hyphen production budget semicolon production budget semicolon raw material consumption budget semicolon raw material purchases budget, right, semicolon calculation of closing stock of raw material. That was a good adjustment in this question. So that is also something we did here. Clear with this, guys? Right? So exactly on the same line is how we compute the remaining functional budgets, like your labor hour requirement budget, your labor budget, right? Then your production overhead budget, selling overhead budget. So all other functional budgets are prepared at the same line. The base is first, sales is a starting point. Sales plus closing stock of FG minus opening stock of FG gives you production. This production budget is the base for all other functional budgets. Clear with this, guys? And that's about this overall area of your production budget. So since this is a marathon, right, I just wanted to do one representative numerical problem for functional budget, right? In our batches we do it in detail, but since this being a marathon, right, I wanted to do one representative question from functional budget and leave it there. Now let's move on to the second segment called as flexible budget. Let's move on to the second segment called as flexible budget. Now let's move on to the next segment of discussion called as flexible budget. Now guys, what is this concept of flexible budget? Now, let me take an example. Now, let us say they have given the following data, right? Now, for 80,000 units of volume, let us say this is an example. Let us say this is a given data. The per unit cost of direct material is 8 rupees. Direct wages, let us say per unit is 4 rupees, right? This is a random example I'm giving you. Then let us say the variable production overheads is going to be 4 rupees per unit. Okay, let me just take it as 6 rupees per unit. Anything is fine. Fixed production overheads, let us say, is 2 rupees per unit. Similarly, your variable administration overhead is, let us say, 5 rupees. Fixed administration overheads is, let us say, 3 rupees. Then your variable selling overheads is 2 rupees, and let us say your fixed selling overheads is 7 rupees. Just an example, right? Now, this is the data given, right, for an output level of 80,000 units. Now, using this budgeted data, they are asking you to prepare a budget for 90,000 units level. Suppose I'm going to produce 90,000 units. What is going to be the cost, right, of all these components, direct material, direct wages, variable production overheads, fixed productions or fixed production overheads and all for 90,000 units capacity level? Now, how will you do this? Simple, guys. So first, what we will do is, now out of these components, we will first identify what are all the variable components: direct material, direct wages, variable production overheads, variable administration overheads, variable selling overheads. These are all variable costs, right? Now, we know that variable costs will remain constant on a per unit level, whereas fixed cost remains constant in total. So now what we do is, in the given budget, right, first what we do, right, we arrive at all the total amount also. So here 80,000 into 8 is equal to 6,40,000. 4 is equal to 3,20,000. 6 is equal to 4,80,000. Right? 2 is equal to 1,60,000. Right? 5 is equal to 4 lakhs. Right? 3 is equal to 2,40,000. Then 2 is equal to 1,60,000. Right? And 7 is equal to 5,60,000. So now what we did, now component wise we have the per unit figure and the total figure with us. Now what will we do? Now this is a budget which is available with us, right? This is called as a static budget or a fixed budget. What is the meaning of that? A budget prepared for one given volume level is called as a static budget, right? Now using the static budget, if you are preparing a budget for a completely different output level, that is called as a flexible budget. Now, in this case, now we need to prepare a budget for 90,000 units level, right? Once again, we need to arrive at the per unit and the total column. Now, first, how will we do that? Simple, guys. We know variable costs will remain constant on a per unit level, whereas the fixed costs will remain constant in a total level. So what we will do, first identify the variable costs. Now, direct material is a variable cost, right? So irrespective of the output level, it will remain constant on a per unit level, right? Direct wages 4 rupees, variable production overheads 6 rupees, right? Whereas fixed production overheads, it is a fixed cost, it remains constant in total. So fill the total column, 1,60,000, right? Similarly, variable administration overheads, fill the per unit column. Fixed administration overheads, fill the total column. Similarly, variable selling overheads, fill the per unit column. Fixed selling overheads, fill the total column. Clear with this, guys? So these are all. Once again, I will just take it out here. I'll just copy paste the figures. Okay, yes. Right. So I'm just taking this and slightly I'm moving it off here so that it's easier for us to capture. Right. So now what we do, guys, now from this static budget, right, or a fixed budget, first we picked the variable components, and the variable component column alone, we filled the per unit column. With respect to the fixed components, we took the total column and we filled here. Clear with this, guys? Now what we need to do, why we did this? Because of the cost behavior pattern, right? Variable cost remains constant on a per unit level, fixed cost remains constant in total. Now we can just complete the remaining parts. Now for the variable components, we have the per unit data, multiply it with the output, you will arrive at the total column. Now with respect to the fixed cost, you have the total column divided with the output, you arrive at the per unit column. As simple as that. Clear with this, guys, right? And that is all we need to do here. Let me just rearrange this. 1 second. Right, and here we have this. That's about it. Right. 1 second. That's all it is. Clear with this, guys? So now this is called as a static budget, right? A static budget means what? A budget which is available for a given volume level. Using the data given in the static budget, if I flex it and prepare a budget for a completely different volume level, it is called as a flexible budget. Here we use the concepts of variable cost and fixed cost, right? The cost behavior pattern is being used. Basically what we do is variable cost remains constant on a per unit level, fixed cost remains constant in total. Based on this, we can prepare a budget for any given volume level. This basically is called as a flexible budget. Now an advanced level sum would be, right, it might not be as simple as this. We'll be doing one numerical problem where now for a different output level we need to prepare a budget, where in the next year maybe we need to prepare a completely different budget for a different volume level with some changes in cost and all. And maybe on certain items of cost might not be constant on a per unit level, it might not be constant in total also. In that case, what we need to do, we need to segregate the total cost into variable component, fixed component, because if it is neither constant on a per unit level nor is it constant in total, it is basically called as your semi-variable cost and all. So that needs to be necessarily segregated into variable and fixed component and needs to be dealt with accordingly. All these issues we will be taking one good numerical example, and with the help of that particular numerical question, we will be covering this entire concept of flexible budget. That's about it, guys. So once again, please go to your solved question bank of your CA intermediate material. All right. So please go to question number 9. Once again, I'm telling you, this question is equally applicable for CMA intermediate students, both paper 8 as well as paper 12 students, cost accounting and management accounting students of CMA intermediate. You can definitely follow this sum because it is also equally applicable for you guys. And again, I want to reiterate that in all our courses, the recordings are separate. I'm not mixing any recordings. For the purpose of marathon, I am just combining it just so that the concepts are similar. So you have everything in one particular place. Clear with this, guys? So here, let's go on to question number 9. Yes, let's go to this particular question, a good question. Right? So one question, I'm taking a comprehensive question and I'm doing it in the marathon itself. We are also covering the numerical problem. So now let's get started here. ABC Limited is currently operating at 75% capacity, and in the past 2 years the levels of operations were 55 and 65% respectively. The present production is 75,000 units. Wait, so 75% capacity represents 75,000 units, which means 100% capacity will represent 1 lakh units, 75,000 by 75%. Now the company is planning for 85% capacity level, which means in the next year they are planning for a capacity level of 85,000 units, and the cost details are available as follows. Now what have they given here? For 55% capacity, basically means 55,000 units volume level, the cost data are given. 65,000 units, the cost data is given. 75,000 units level, the cost data is given. Right, guys? Fine. Now, what have they given? Direct material, direct labor, factory overheads, selling overheads, admin overheads. Remember, all these figures are given in total, right? And they have totaled up all the line items as well. The profit is estimated at 20% on sales, right? So profit is going to be what? on top of this cost, you need to add a profit which is equal to 20% on sales, right? You need to arrive the sales value. Now, the following increase in the costs are expected in the next year. First, guys, 3 different volume level is given, right? In the next year, the company is planning for what percentage of capacity? 85%, which means they are planning for an output of how much? 85,000 units, right? So obviously what we need to do, analyze which are all the variable costs. Variable cost remains constant on a per unit level, whereas fixed cost remains constant in total, right? Now, over and above this, look at this. The following increase in costs are also expected during the next year. First, direct material, they're expecting an 8% increase. Direct labor, 5% increase. Variable factory overheads, 5% increase. Variable selling overheads, 8% increase. Fixed factory overheads, 10% increase. Fixed selling overheads, 15% increase. And administration overheads, a flat 10% increase. Prepare a flexible budget for the next period, that is 20x2, x3 at 85% capacity level, right? Also ascertain the profit and the amount of contribution. This is what they have asked in this particular question. So now, since they have asked for profit and contribution, so you need to prepare this in a marginal costing income statement format. Sales minus all the variable costs gives you contribution, right? Minus fixed cost gives you what? Your profit, right? But before that, once, how will you get the sales? For you to get the sales figure, first you need to arrive at the total cost, because total cost plus profit is only sales figure, right? So basically what we will do, first we will arrive at all the variable costs, to that add all the fixed costs separately, right? Arrive at the total cost. From that add whatever is the markup profit required, we arrive at the sales value, and then finally we list down sales minus variable cost equal to contribution, right? And the sales minus total cost gives you profit. That way also we can do it. Clear with this, guys? But before that, first let us get started with this question. Maybe if you want, pause the video now and try to attempt this by yourself. A masterpiece, good question, right? To cover a representative coverage of this flexible budget, a good sum to revise the day before your exam, right, guys? Of course, in our regular and exam oriented batches, every single sum I will be doing, right? However, in a marathon, I didn't want to actually omit the sums and all. At least one representative sum from concept I want to do, so that it will be a very good effective way of revising this entire chapter. Fine, guys, maybe if you want, you can pause the video now and try to attempt this particular question by yourself. Now let's get started. First one, sir, I want to, first what I need to do, I need to segregate the cost into variable component or fixed component. First, how do we do? Guys, ideally speaking, any 2 levels is enough. In this question, they have given 3 levels of output. Sir, first, why do we need so many levels of output, sir? Now, which costs are variable, which costs are fixed? How do we know? Simple. Now, first, direct material. Let us take 55% capacity level and 75% capacity level. Take extremes, right? Now, calculate the direct material cost per unit. First, you tell me, is direct material fixed? Definitely not. Why? Had it been fixed, it would have been constant in total. Now, is it variable? Let us check. How will we check? Arrive at the per unit cost of direct material. So if it is constant on a per unit level, it is going to be your variable cost. Now 11 lakh divided by 55,000, how much is it? So it's going to be 20 rupees per unit here. How about 75% capacity level? 15 lakhs divided by 75,000 gives you how much? 20 rupees only, which means now this is constant on a per unit level, hence this is a variable cost. And it varies at the rate of how much? It is going to be 20 rupees per unit. Next, labor. 5,50,000 divided by 55,000. How much is it? 10 rupees per unit. Take the extreme level. 7,50,000 divided by 75,000. How much is it? 10 rupees per unit. Clearly, this is also a variable cost. Next one. Take your factory overheads. Is it fixed? 3,10,000. 3,30,000, 3,50,000. No, it is not constant in total. Clearly, it's not fixed. Let us check whether this is variable. Now, 3,10,000 divided by 55,000. How much is it? You get 5.63 something. Now, is it okay? So at 75% capacity level, 3,50,000 divided by 75,000. How much you get? You get 4.66 something. Now, if you see, it is not constant in total, and it is also not constant on a per unit level. So clearly this is a semi-variable cost. And if you have a semi-variable cost, what you need to do, segregate this into fixed and variable component. How will you do that? Literally, this is something that we have actually learned in both basic concepts, I mean, which I generally do in our regular and fast EVO batches. But anyways, even in this marathon, we have covered in volume analysis, right? That is difference in total cost divided by difference in units. You will be able to get your variable cost per unit, and with that you can segregate your total cost into variable and fixed components, which I'll be doing here, right? Next one, selling overheads. Now, is it fixed? 3,20,000, 3,60,000, 4,00,000. It is not constant, it total. Let's check whether this is variable. 3,20,000 by 55,000. How much is it? It's going to be 5.818181. Here it's 4,00,000 divided by 75,000 is going to be 5.33 something. So it is not constant in total. It is not constant on a per unit level also. This is also a semi-variable cost, which means it needs to be segregated into variable and fixed component. Next, admin overheads. Is it fixed? Yes. 1,60,000, 1,60,000, 1,60,000. So clearly my admin cost is going to be a fixed cost. Clear with this, guys? So now the first thing I need to do is segregate, right, my factory overheads and selling overheads. I need to segregate it into variable component and fixed component. Clear with this, guys? So how do we do that? That is the first part of discussion in this particular question. So now quickly let's get started here. So now first one, factory overheads. So please have the question with you. So this is question number 9. Question number 9. The first one, I'm having a working note for factory overheads, right? So factory overheads. Now clearly, guys, for 55,000 units level, how much is my factory overheads? Yes, it was 3,10,000, right? And for 75,000 units level, how much was it? It was 3,50,000 rupees, right, guys? This was units. So now can I say variable component is going to be difference in fixed cost? How much is the difference in the total cost? How much is the difference here? It's going to be 40,000 rupees. So 40,000 divided by difference in the units. How much is the difference in units? So 75 minus 55, basically it's going to be 20,000 units. Or in other words, logically, my cost, overall cost increased by 40,000 rupees because my units increased by how much? 20,000 units. Guys, clear with this? So the increase in the total cost is purely on account of the variable cost incurred for the incremental units. Or in other words, how much is the variable cost per unit? 40,000 divided by 20,000, you get how much? So rupees 2 per unit. Now with this, you can arrive at your fixed cost. Fixed cost is equal to, right, total cost minus variable cost. Now you take any one volume level, right? Let us take 55,000 units as the volume level. At 55,000 units, how much is the total cost? 3,10,000. That is the total fixed over in total, factory overheads, right? Minus how much is the variable component? 55,000 into 2, right? So basically you get 3,10,000 minus 55,000 into 2 is going to be 1,10,000. So basically you get how much? Rupees 2 lakh. Clear with this, guys? Right? So now my fixed component of your factory overheads is going to be 2 lakh rupees. Variable component is going to be 2 rupees per unit. Are you guys clear with this? Right? So this is something that you need to actually have in mind, as simple as that, right? And of course, in this particular question, this is subject to some price increase and all. What it is, we will just see it later. But as of now, clearly we know that the variable factory overheads is how much? So factory overheads, if you see, 1 second. So here, so factory overheads, if you see, variable component is 2 rupees per unit. It's 2 rupees per unit. The fixed component is going to be rupees 2 lakh in total. Clear with this, guys? Right? This is the story about your factory overheads. Next one. What is the other one that they have mentioned? The next one is regarding The next one is regarding your selling overheads. This is also semi-variable. Now let's take the two extreme volume levels, 55,000, 75,000. How much is the figure? 3 lakh 20 and 4 lakh. Let's take these two figures. All right. So this is a separate working note for what? It is a separate working note for selling overheads. Now guys, 55,000 units level, that is 55% capacity. So 55,000 units. The other one is how much? 75,000 units. I'm just taking the two extreme, the two extreme output level. Now, units. In this case, how much is my selling overheads? At 55,000 units level, it's going to be rupees 3,20,000. And at 75% level, it's going to be how much? Rupees 4 lakh. Right? So my variable cost is going to be the difference in the total cost, which is going to be how much? The difference in the total cost is going to be, right? How much is it, guys? The difference in the total cost is going to be here 80,000 divided by the difference in the total units. How much is it? So it's going to be 75,000 minus 55,000. How much is that, guys? It's going to be 20,000 units. So basically, I'll say 80,000 rupees is the variable cost pertaining to 20,000 units. How much is going to be on a per unit level? It's going to be rupees 4 per unit. Now, how much is the fixed component here? So the fixed cost is equal to total cost minus variable cost. So take any one volume level, 75,000 units volume level. What is the total cost of selling overheads? 4 lakh minus how much will be the variable component? 75,000 into 4, right? So how much is 75,000 into 4? It's going to be 3 lakh. So 4 lakh minus 3 lakh, you get how much? You get 1 lakh rupees as the fixed component of selling overheads. So basically, guys, selling overhead, variable component, fixed component. Variable component is going to be 4 rupees per unit, and the fixed component is going to be rupees 1 lakh. Are you guys clear with this? Right? Are you guys clear with this? Right? And that is all about this particular part of this particular question. Right, guys? So selling overheads we have, and production overheads, factory overheads we have. Now the other parts are readily available. Direct material 20 rupees per unit, variable component, right? Only variable. And your direct labor, it is going to be 20 rupees per unit. These are all variable components, right? And how about your admin overheads? It's fully fixed, 1,60,000 rupees. Clear with this, guys? So now let us just list out the summary. Let us just list out the summary. Now quickly here, I'm just writing out summary. Now, what are all the line items of variable costs here? Line items of variable cost. First, you have direct material. How much is direct material? Just now we saw 20 rupees per unit, correct? Present cost, how much? 20 rupees per unit. Wait, this is subject to change. That I'm not coming to. I have not come to that, as of now. We will do that. Don't worry. Next up, how much is the direct labor? Fully variable, 10 rupees per unit. So direct labor, 10 rupees per unit. Right? Next one. Third. Then what is the other variable component? Now I have factory overheads, variable component, 2 rupees. So variable factory overheads, rupees 2 per unit. Fourth one, variable selling overheads is going to be how much? 4 rupees per unit. Right? These are the ingredients of your variable costs. Next, what are the things you have in your fixed costs? In fixed costs, we have first one, factory overheads. So first one, factory overheads. How much is that, guys? It's going to be 2 lakh rupees. We saw here. So write it up here. It's going to be rupees 2 lakh. This remains constant in total. Number 2, your selling overheads. You have fixed component. How much is it? 1 lakh rupee. We calculated it, right? It's going to be rupees 1 lakh. And the third one is your administration overheads. It is fully fixed. We saw here how much was that? 1,60,000, right? So it's going to be rupees 1,60,000. These are all the ingredients of the cost as of now, right? Now let's go further and read the question. What have they said? In the upcoming year, sir, variable cost clearly on a per unit level I have. Fixed cost I have it in total. Wait. Now they are saying there is a following increase in the costs. Direct material costs are going to increase by 8%. Labor costs are going to increase by 5%. Variable factory overheads by 5%. Variable selling overheads by 8%. Fixed factory overheads by 10%. Fixed selling overheads by 15%. Administration overheads by 10%. Now we need to apply all these changes. But remember, the changes, right, should be applied. For the variable cost, the changes should be applied on a per unit level, and for the fixed cost, the changes should be applied in total. Now let's apply all the changes and we will arrive at the revised figures. Now guys, first one, direct material cost, it is going to increase by how much? 8%, which means in the upcoming year it's going to be 20 into 108% or 1.08. How much is this? 20 into 1.08. It is going to be how much? Rupees 21.60 per unit. So for the upcoming year, the direct material cost is not going to be 20 rupees. It's going to be 20 rupees into 108% because 8% increase is going to be there. Next, direct labor is going to increase by how much? 5%. So into 1.05. So 10 into 1.05 gives you how much? Rupees 10.50 per unit. Next, fixed variable factory overheads. How much is it going to increase? It's going to increase by another 5%. So into 105%, how much is this? 2 into 1.05 gives you how much? 2.10 rupees per unit. Clear with this, guys? And how much is the variable selling overheads? It is going to increase by how much? 8%. So into 108%. So or into 1.08. How much is that? It's going to be rupees 4.32 per unit. Clear with this? That's about it. Next one. How about your fixed cost? My fixed factory overheads is going to increase by 10%. Please have the question with you. So into 110%, how much is that going to be? It's going to be rupees 2,20,000 as a whole. So please be careful. For variable cost, I'm applying the change on a per unit level. For fixed cost, I'm applying the change in total. How about your fixed selling overheads is going to increase by 15%. So into 115%, how much is that going to be? 1,15,000. Right? Right, 1,15,000. Then administration overheads is going to increase by 10%. So into 110%, how much is that? 1,16,000 to 1.1 gives you rupees 1,76,000. Are you guys clear with this? So now for the upcoming year, we need to prepare a particular flexible budget for 85% capacity level, 85,000 units level. Very simple. So 85,000 units level, all the variable costs we have on a per unit level, right? Respective variable cost multiply with 85,000 rupees, 85,000 units, you will arrive at the total column, right? And the fixed costs are readily available in total. These figures you can directly apply. That is what they have also mentioned here. Budget for 85% capacity level. Now, first direct material, how much is it? 21.6. This is what we also found out. Right? Next, direct labor, how much is it? 10.50. This is what we found out. Next, direct variable factory overheads, 2.10. Look at this, 2.10. Variable selling overheads was 4.32. Look at this, 4.32. Right? Now the respective figures you have, multiply this with 85,000, you will arrive at the total column. Right? The total variable cost, and you will get the per unit and the total figure. Next, fixed costs, how much you get? Fixed factory overheads was 2,20,000. Look at this, 2,20,000. Fixed selling overheads was 1,15,000. Yes, you get 1,15,000. And fixed AOH was 1,76,000. You get 1,76,000. So the sum total of all the fixed costs comes out to the sum of these three. How much was that? 2,20,000 plus 1,15,000 plus 1,76,000. You got a total fixed cost of 5,11,000. Clear with this, guys? So the total variable cost, here is a figure. The total of fixed cost 5,11,000. So what do you get? 32,74,200 plus 5,11,000. How much you get as a whole? The total cost for the company is going to be 37,85,200 rupees. Now they are saying the company expects. How do you fix your profit? I mean, how do you fix your selling price? Your total cost, add a profit. How much is the profit? 20% on sales. What is the meaning of this? What is the meaning of this? Now, cost, profit, selling price. Now they are saying profit is 20 percentage on sales. So which it is on sales. Hence, if you keep your selling price as 100, profit will be 20. How much will be the cost? 100 minus 20, cost will be 80. Guys, clear with this? So now I have this. So now if my cost, right, is equal to 80, how much will be my profit? Right, so if 80, so 37 lakh 85,200 is 80, how much is equal to 20? Reverse calculate. So 37 lakh 85,200 divided by 80 into 20, if you do, you will get a profit of how much? 9 lakh 46,300. So 37 lakh 85,200 plus 9 lakh 46,300, you will get the total sales as how much? 47 lakh 31,500 rupees. Clear with this, guys? With this, you arrive at the sales figure, you arrive at the profit. This profit was also asked in the question. We arrived at it. How do you calculate the profit? 37 lakh 85,200 divided by 80 into 20. That's how you arrive at the profit. Guys, clear with this? Now, they had also asked for contribution. Simple. Sales minus variable cost gives you contribution. That is 47 lakh 31,500 minus 32 lakh 74,200. You get how much? 14 lakh 57,300. That also you can arrive at it. Clear with this, guys? And with this entire sum is over. And all these things we have actually done. Clear with this, guys? A very good and a comprehensive question wherein we saw the concept of flexible budget with changes in your cost. And this sum we had to analyze and find out which costs are all variable, which costs are all fixed, and which costs were all semi-variable. And for those semi-variable costs, we had to segregate it into variable component, fixed component, and on these costs we had to apply some changes and arrive at the revised cost for the upcoming year, and on that cost add the profit, arrive at the sales, and having arrived at the sales, now arrive at the contribution, which is sales minus variable cost. A very good numerical problem to actually sum up the entire concept of fixed and flexible budget. Clear with this, guys? So please go and update your library of adjustments. Please go and update your library of adjustments. Write down flexible budget hyphen identification of costs into VC and FC, variable cost and fixed cost, semicolon, segregation of semi-variable costs. Write down segregation of semi-variable costs, semicolon, segregation of semi-variable cost, semicolon, increase in costs. Write down increase in costs. This was also given. Increase in costs, semicolon, calculation of expected sales. Calculation of expected sales. It was completely a reverse working question, a beautiful question, and in my opinion, this question is a must visit the day before your exam. Whether you are a CA intermediate student or a CMA intermediate student, be it paper 8 cost accounting or paper 12 management accounting, this is a masterpiece problem which I would suggest is applicable for everybody, right? Though I am taking this from CA Institute, from our CA question bank, right, which I have prepared, right? I'm telling you this concept and this particular question itself is equally applicable even for CMA intermediate students, right? There in CMA intermediate courses, I would have done certain questions directly from the CMA Institute study material, but for the purpose of revision, I'm telling you, definitely this kind of question can be expected across all the courses. Clear with this, guys? And with this, literally, this entire chapter of budget and budgetary control is over. Clear with this, guys, right? And that's about this particular chapter. Now, in your management accounting, right, literally the same chapter is only there in your CMA intermediate. I'm telling you, paper 12, you have the same chapter, but it is called forecasting, budgeting, and budgetary control. What do you mean by a forecast? Basically, it is only theoretical in nature. Forecast basically represents, right, a short a short budget, a shorter version of budget. Sir, what do you mean by this? Now, let me just quickly walk you through just 2 minutes time, and with that we will be done. Now, please take page number 119. This is there only for CMA Intermediate Paper 12 students, right? So management accounting students, right? Quickly, that's all. 5 minutes and we are done, right? Now, look at this. Difference between forecast and a budget. First, I will tell you. Budget is basically a detailed plan of action which we prepare. Let us say for this upcoming year, right? Whatever we prepare in detail. Production budget, your sales budget, and everything. We prepare it in detail. Now, having prepared the budget, let us say the first month got over. So now, based on the actual trends which happened in the first month, right? Now, if I am predicting what is going to happen in the next month, let us say in the month of May, first month was April, whatever has happened, though for the entire year the budget has been prepared, based on the current trends, sir, the first month has started. Based on that, I am predicting the probable events. I am predicting the probable events for the upcoming month, right? For a shorter period of time. This is called a forecast. Sir, why do we do that? Simple. Though I have a budget in place, I generally have a forecast just to make sure that whether I am going in track with the budget or not. At least the next month, will I be going in track with the budget or not? Clear with this, guys? This is just a prediction or an estimate that I make. Now, based on this budget, we don't do any variance analysis calculation and all, right? Maybe this estimate or this particular forecast can be useful for preparing future budgets also. Are you guys clear with this? Now, based on this in mind, you just read it. Now, that's why they say weather forecast, right? In weather, right, when they are predicting the climate and all, they do a weather forecast. They don't do a weather budget. Forecast is basically for a shorter period, 1 week, 1 month, right? That's all. They don't predict the weather for the entire period, for the entire year. Clear with this, guys? Budget is generally for a slightly longer period of time, or forecast is basically for a shorter span of time. Now you can read this. Now, forecast is an assessment of probable future events. Budget is a planned result which a business wants to achieve. Forecast is an estimation based on past and the present data. Clear with this, guys? After the first month, based on the trends, I am analyzing what is going to be happening in the next month. Budget is a financial plan expressed in number. Forecast, it focuses on what a business will achieve, whereas budget focuses on what a business wants to achieve, right? This is what you are supposed to do. Whereas forecast, sir, first month this happens, sir. I know second month, more or less, this will only happen. It's a prediction, right? Based on a forecast, we don't set any target. We only give a prediction. Whereas budget, it sets a target, right? Forecast, it is updated at regular intervals. Monthly I do, or quarterly or annual. Budgets usually are done on an annual basis. Now you guys are able to understand, right? Using a forecast, variance analysis is not required. Whereas using a budget, we do variance analysis, favorable, adverse variances, all these things we do in standard costing, right? Now, forecast, it precedes budgeting. That is, it acts as an input for variables like sales, prices, wages. Based on the forecast, maybe I can provide an input for the future budgets. Whereas, right, when it comes to budget, it uses the forecast data to create a budget. Past forecast data are used to create future budgets, right? Now, scope, forecast projects operations, customer reach, revenue, profitability, and all these things. Budget, it generally guides for profit planning and cost control. All these things they have given. Basically, guys, forecast is a prediction done for a shorter span of time, but budget is generally an entire detailed plan of action saying this is the sales I want to achieve, this is the cost you are allowed to incur, overall this is the budget profit and all. Clear with this, guys? Only theoretical thing is there in your CMA Intermediate paper 12, but for that there is no difference at all. Clear with this, guys? Numerical problems, everything is the same both in CA Inter as well as in CMA Inter paper 8 and in paper 12. All these things are the same. Clear with this, guys? And with this, we have completely covered this chapter called as budget and budgetary control. Clear with this, guys? Right? So now on this note, let's move on to the next chapter. Hey folks, welcome you all to a new video. This is CA Ganesh Bharadwaj. So this is the part 2 of your CA Inter Costing Marathon applicable for May 26, September 26 and Jan 27 attempt, right? So this is just in continuation with the part 1. So as I already gave you guys an introduction in part 1. So in part 1, these 3 chapters would have been covered: marginal costing, standard costing, and budgetary control. And in part 2, this particular video, we will be covering cost sheet, overheads, ABC, cost accounting systems, employee cost and direct expenses, material cost and service costing, right? So part 1 plus part 2 put together is going to be for about 20 hours, and these 10 chapters put together gives you a coverage of roughly about 75 to 80 marks. This is what I'm expecting, right? So this is just, once again, I just wanted to give you guys the context. So please continue watching this particular video. And of course, the books that we have used in this particular marathon is our concept decoder book. So I would have used this concept decoder book, right? It's a full color book, and then part 1 and volume 1 and volume 2 of our solved question bank. So we have those 2 volumes of solved question bank. So these are the books I would have used here, and these books can be downloaded free of cost on our website, right, under the free resources section. So please continue watching the marathon. So now let's get started with the revision of this chapter called cost sheet. Now guys, this chapter is a very, very important chapter from an examination perspective, because on an average, every single attempt, this chapter gets tested for 10 marks. So especially if you are revising this chapter, or if you're watching this marathon a week before or even the day before your exam, this is a must visit chapter, a never miss chapter for your examination purposes. At times, I've also seen they have tested one full question in cost sheet as a part of your case study based MCQs, right there, or maybe in your descriptive area also they have tested. Such is the importance of this chapter. Now guys, let's quickly go and revise this entire chapter with all the concepts and other important things. We will also be doing a couple of numerical problems from our solved question bank. So let's get started. First of all, what do you mean by a cost sheet? A cost sheet is nothing but a statement containing all the cost data. You keep on adding all the cost, and finally you arrive at the total cost that you have incurred for manufacturing and selling this product. Now, the format of cost sheet is given as follows. So this is the format: opening stock of raw material plus purchase of raw material minus closing gives you direct material consumed, add labor expense prime cost, add POH gross works cost, add opening WAP minus closing WAP gives you factory cost, then some red ink items are all there. So the entire format of cost sheet goes like this. You arrive at cost of sales, add profit, you arrive at sales. Now guys, there are many students who struggle with the format of cost sheet and they end up mugging this up. Now trust me guys, in the next 15 to 20 minutes we will be looking at this logic of this format of cost sheet, and by the end of this next 15-20 minutes, trust me, I will make sure that you yourself can come up with the format of cost sheet without mugging up, with full conceptual knowledge. Shall we get started now? Yes. Now forget this format of cost sheet. Now earlier there was an old format of cost sheet which institute used to follow. Sir, why are you starting with this old format of cost sheet? With this, it is easier for you to get into the latest format of cost sheet. Now what they did earlier, there were this entire cost sheet that we have seen, it was broken up into 2 statements. Statement number 1 was called as cost sheet. Statement number 2 was called as income statement. Now what was this statement number 1 cost sheet? Opening stock of raw material plus purchases minus closing stock of raw material gives you something called as direct material consumed. To that, if you add direct labor and direct expense, you get something called as prime cost. To that, if you add production overheads, you arrive at gross works cost. To that, if you add opening WAP minus closing WAP, you get your net works cost, or this is also known as cost of production. To that, if you add opening FG, subtract closing FG, you arrive at cost of goods sold, right? And statement 2 is your income statement, ulta. Sales minus the cost of goods sold, which you get in your statement 1, gives you something called as gross profit. From that, subtract administration expense and selling and distribution expense, you get something called as operating profit, which is nothing but your EBIT. Now sir, what are all these things? Now very, very simple and easy. Now guys, for you to understand the concept and the logic for this format of cost sheet, now you need to understand that in a company, every company, it has 3 locations. What are the 3 locations? One is called as a factory. The other one is called as a corporate office. And finally, you have a place called the sales depot. What happens in the factory? Production activity happens in a factory. What happens in a corporate office? Administration work, board of directors, they take decisions sitting in the corporate office. And finally, in a sales depot, this is the place where the selling and distribution activity happens. Now, further, if you zoom into the factory, inside the factory itself, there are three locations. What are the three locations? One is called as stores. Now we have entered into the factory. In the factory, you have a place called stores. In the stores area, raw material is getting stored there. Guys, correct? Next, you have a place called factory shop. This is the place where machines are located, where the raw material we will receive it from the stores and it gets converted into finished product. Are you clear with this? Or in other words, this is the area of WIP, work in progress. And once the products are completed, it gets transferred to an area called warehouse. This is the place where your FG is being stored. FG is being stored. Is that clear, guys? Right? These are the three locations inside the factory. Are you all able to understand? Yes. Now, in my factory, in my stores, first, let us talk about stores. Stores is the place where raw material is getting stored. Now, at the beginning of the period, I might be having some opening stock. Guys, correct? Let us say I have 10 kgs of raw materials already, right? And on top of this, in this period, I purchased 100 kgs of raw material. Now, I have a total of how much? 110 kgs. Now with this 110 kgs, what can I do? Maybe one portion of it, I can consume it. Means what? I can issue it to my factory shop. And the balance, it can be remained as unconsumed. That is closing stock of raw material. Am I right, guys? Now let us say out of this 110 kgs available, 80 kgs were only consumed, which means the balance 30 kgs were left in my stores area as closing stock of raw material. Guys, correct? Or in other words, this 80 kg is only being used, is being consumed for the purpose of producing my finished goods. Am I right, guys? Are you all clear with this? Hence, now this direct material consumed is ideally the direct material cost incurred for the purpose of producing my FG. Am I right, guys? Hence, the first thing you need to know is direct material cost does not mean direct material purchased. It refers to direct materials consumed, because only using this cost, right, I am trying to complete and produce my FG. Are you all able to understand? So now, how will I compute this direct material consumed? Simple. I can say opening stock of raw material plus purchases minus closing stock of raw material. The net of these three figures, if I do, I will be able to arrive at my direct material consumed. Am I right, guys? That is, the total raw material available minus what I didn't consume will give me the balancing figure of what I have consumed. Is that clear, guys? Are you all able to understand? That is the logic for the first line item, which is direct material consumed. Opening stock plus purchases minus closing stock gives you direct material consumed. Is that clear, guys? Now I enter into this area called as a factory shop. Now, will the raw material get converted into FG automatically? No. Now, on top of this raw material, direct material, I need to incur direct labor. Then I need to incur direct expense. Guys, correct? Now, sum total of direct material, direct labor and direct expense, three direct costs, right? The sum total of these three is called as prime cost. What is it called as? Prime cost. Is that clear, guys? Right? So prime cost is nothing but sum total of all the direct costs. Direct cost means what? The costs which are readily available on a per unit level, traceable to every unit produced. Is that clear, guys? Now, on top of this, there could also be some indirect costs incurred in the factory. They are not incurred on a per unit level. They are incurred in bulk total, but they are incurred in the factory only. So I will still continue to use that for the purpose of valuing every unit of stock. These are called as production overheads. Is that clear, guys? Now POH is also incurred in the factory only. Guys, correct? So now what do? These three is called as prime cost. To that, if I add production overheads, now I will be arriving at the full, all the total cost incurred in the factory. Am I right, guys? Right? Are you all able to understand? Now, you should know one thing. In the WIP area also, at the beginning of the period, you can have some opening WIP. And at the end of the period, you can have some closing WIP. First of all, what do you mean by WIP? WIP means units I have started to produce, but at the end of the period, I didn't turn it into a completed product. It is still remaining as incomplete. Am I right, guys? Are you all able to understand this? Are you all able to understand this? Yes. So now what I do, so direct material plus direct labor plus direct expense gives me prime cost. To that, if I add production overheads, I call it as, look at this, prime cost plus production overheads, I call it as gross works cost. Why, sir, gross works cost? Obviously to this, I should add opening WIP and subtract closing WIP. If I do that, I will arrive at the value of completed products, guys, correct? Or in other words, guys, whatever cost I incur here, using this cost, some units can be completed and transferred to FG. Some units I have started the work, but it is not yet completed, guys, correct? Hence, it still remains in my WIP area as closing WIP, guys, correct? So now, what is the value of units completed and transferred? Simple. The sum total of all the costs I have incurred here, I call it as gross works cost. To this, add opening WIP minus closing WIP, you will arrive at the cost of production. Are you all able to get this? Is everyone able to follow this? Right? This is what they have mentioned here. So direct material plus direct labor plus direct expense gives you prime cost plus POH, call it as gross works cost. Why gross? Because we are yet to net of what? We are yet to net of opening and closing WIP. Add opening WIP, subtract closing WIP, you arrive at net works cost, also known as a cost of production. Are you all able to understand this? Yes. Now, this cost of production enters into my FG area, warehouse, guys, correct? Now, this is the value of units completed and produced in this period, guys, correct? Now, in my FG area, obviously, I can have some units already produced in the previous period, but it was not sold in the previous period. That is called as opening FG, guys, correct? In the previous period, it was closing FG. This period, it becomes an opening FG. Am I right, guys? Let us say I have 100 units in opening FG, right? Current year, I produced 1000 units. Overall, how many units are available? 1100. Am I right? Now, out of this 1100, let us say I have sold 900 units, which means the balance 200 units are lying in my closing stock. Am I right, guys? Now, this is, can I say, first I get this cost of production now. To my cost of production, if I add opening FG, this will give me the total value of goods available for sale. Out of that, if I reduce the closing FG, which means what? The value of goods unsold, I will arrive at what? The cost incurred in respect of units sold, popularly called as cost of goods sold. Or in other words, now what will be, how will you arrive at it? Cost of production plus opening FG minus closing FG will give me cost of goods sold. Are you all able to understand this? Logical, no? Guys, correct? So now what happens? Now the goods move outside my factory. Is that clear, guys? So now what is the formula here? Cost of production plus opening FG minus closing FG gives you cost of goods sold. Are you all able to understand? So now in this statement 1 of the old format, whatever we are seeing is actually, it captures whatever happens inside the factory area. Is that clear? So now how does it start? Opening stock of raw material plus purchases minus closing stock of raw material gives you direct material consumed. To that, add direct labor, add direct expense, wait, subtotal, call it as prime cost. Now add production overheads, call it as a gross works cost. Now to that, add opening WIP minus closing WIP, you get cost of production. To that, add opening FG minus closing FG, you get cost of goods sold. Is that clear, guys? Are you all able to understand? Yes, that's about it. That's about it. Now what happens in your statement 2, income statement, right? Now what you do, you start from the reverse. First, sales revenue minus cost of goods sold, you subtract this figure, right? How did you get this figure? Just now we got it, correct? right, you arrive at your gross profit. Basically, guys, cost of goods sold only consider the cost incurred in the factory. Now, if you were to prepare a trading and a P&L account, right, ideally speaking, all the costs incurred in the factory are considered only in trading account. Guys, correct? Now, sales minus cost of goods sold gives you gross profit. Am I right, guys? Now, from the gross profit, you reduce the costs incurred outside the factory in two other locations. What are the two other locations? Corporate office and your sales depot. Cost incurred in your corporate office is called as administration overheads, administration cost, and the cost incurred in your sales depot is called as selling and distribution expense. So from your gross profit, you subtract P&L items AOH and SOH. You arrive at operating profit, which is nothing but earnings before interest and taxes. Is that clear, guys? So literally all the costs incurred in the factory are trading account items, and any costs incurred outside the factory, namely your corporate office AOH and sales depot, which is SOH, these are P&L account items. Am I right, guys? So these two will come only in your income statement. In your cost sheet, statement 1, you will only get your factory related expenses. Is that clear for everyone? Right? Are you all now able to understand? This was earlier followed under the two statement approach of cost sheet. Is that clear, guys? Now, sir, this old statement should we write in exam? Now they have arrived at the new statement. Now with this old, if you get into the new, you will get a complete hold and control of the new format of cost sheet. Now, new format of cost sheet. If you notice in the new format of cost sheet, two things, there are two changes. Change number 1. They have merged these two statements into a single statement. That is number 1. Number 2, if you notice, they have added certain other line items. What are they? We will be seeing it. Is that clear? Shall we get started, guys? Yes. Now, first, what have they said? First is your stores area. What is your stores area? Opening stock of raw material plus purchases minus closing stock of raw material gives you direct material consumed. Now you enter into your factory shop. Direct material consumed plus direct labor plus direct expense weight, call it as prime cost. Now to this prime cost add production overheads incurred inside the factory, all the indirect manufacturing costs incurred in the factory. Example, factory rent, repairs and maintenance, supervisor salary, depreciation, any indirect cost incurred in the factory which is not directly traceable on a per unit level, park it under POH. Now subtotal, call this as gross works cost. Why gross? Because we are yet to adjust opening WAP and closing WAP. Visualize whatever I taught you there in that account format. Ideally that is called as flow of cost, right? You should understand the flow of cost. With that you can write the format of cost sheet by yourself. Is that clear? Now from this add opening WAP minus closing WAP. Now call that as factory cost. Now this is where there is a small change. What is it? I will tell you. Now there, if we subtotal net of these two, we call it as a factory cost. Am I right, guys? Now here we are not calling it as a factory, there we call it as a cost of production. We are calling it as a factory cost. Now sir, what are the differences? Now 4 additions and 1 deletions were newly introduced by ICAI. Right, sir? When, sir? Before 2018, they were following two statement approach. Now, for a very long period of time, now this new approach is only there. But that old approach will give you the reasoning to enter into the new approach. Now, 4 addition, 1 deletion. What are the 4 addition, 1 deletion? Number 1, quality control cost. What do you mean by quality control cost? Now, the moment a product is produced, inspection should be carried out. Am I right, guys? Now, you might have noticed in your plastic articles and all, there is a sticker called tested OK or QC passed and all, quality control passed. So what they do is, so they hire some, they have an inspection team that will inspect the quality of the product produced. Is that clear? Now you tell me, where is the inspection happening? In which location? In the factory only. Guys, correct? Now, ideally speaking, this is an indirect manufacturing cost incurred in the factory. So ideally speaking, this is a part of your production overheads only, but institute wants you to specifically mention it as a line item on the face of cost sheet. That's all it is. Ideally speaking, all your indirect manufacturing costs should be coming under a single line item called production overheads, but ICA wants you to mention it on the face of cost sheet. Is that clear, guys? Right? That is the first line item. What is that, everybody? Quality control cost. Next, second, there is another cost called research and development. Right? Let us say I am Maruti. Maruti Suzuki, right? I'm planning to come up with an innovative technology where cars will run on salt water using some hydrogen technology, right? So it will run on salt water and all. Maybe I'm coming up with this kind of research. Now this is related to production, right? Now what I will do, whatever is the cost relating to R&D, that will also form part of your cost sheet, right? Ideally speaking, it is an indirect manufacturing cost, should have been a part of POH, but institute expects you to present it on the face of cost sheet. Is that clear? So what is the second line item, everyone? Research and development. Third line item, administration overheads related to production. Sir, what do you mean by administration overheads related to production? I will give you guys an example. Now guys, now let us say there is a worker, right? Assembly line worker. Now I am a car manufacturing company. Okay. Now there is a worker who needs to fit the doors of a car, right? Now let us say a car has 6 doors. 4 doors, 1 bonnet, 1 dicky. And let us say to fit 1 door, the worker will take 1 hour, right? Which means for 1 car, he will take how many hours? 6 hours. Let us say I pay labor cost I pay at the rate of 100 rupees per hour, which means per car, I know that the worker has to work for 6 hours. Per hour, I need to pay 100. So, which means the labor cost per car is going to be 600 rupees. Now, any wages paid to this worker, I treat it as a part of direct wages, directly traceable on a per unit level. Am I right, guys? Yes. Now, this worker has a boss. His name is supervisor. Now, what will the supervisor do? That guy, he will be standing like this and he will be monitoring the work that is happening in the office, right, in the factory. Now, for every hour he stands, now 50 cars will be manufactured. Can I come up with this kind of relationship? No. This guy, he is basically required to make sure that these workers are working. Hence, no doubt it is incurred in the factory for the purpose of production, but it is not direct in nature. It is indirect manufacturing cost. Hence, I park it under production overheads. Is that clear, guys? Now, this supervisor also has a boss. Who is he? He is called the plant manager. Okay. Now, this plant manager, he will not be standing and supervising the workers and all. In the factory only he will be sitting, but he will be sitting inside an AC room. But this AC room is in the factory. Is that clear? It is not in corporate office. If it is in corporate office, any expense incurred in corporate office will be taken to administration overheads. Is that clear? Now, this guy is sitting in the AC room in the factory. Is that clear, guys? Now, in this case, what I call this is any salary paid to this person is administration overheads related to production. This is not general administration overheads. This is AOH related to production. Is that clear for everyone? Is that clear for everyone? Now, ideally speaking, any plant manager salary as well as supervisor salary, both are indirect costs incurred in the factory. Ideally POH. Yes, but institute wants you to take this separately and mention it as a line item once again. Is that clear for everyone? Right? That is exactly what they have mentioned here. Administration overheads related to production. Are you all able to understand? Yes. So 3 items you have seen till now. What are they? Number 1, quality control cost. Number 2, research and development cost. Number 3, administration overheads related to production. Last one, 4th line item. What is it? Primary packing cost. Now guys, for this you should understand what is a primary packing, secondary packing. Guys, packing cost can be classified into 2. One is primary packing, the other one is secondary packing. Now sir, what do you mean by primary packing, secondary packing? As usual, I will give you guys an example. Recall the example I have given you in our regular batch, if you guys are aware of that. Yes. Now let us say I am in the business of manufacturing soft drinks, very healthy drink called Coca-Cola, right? Now guys, now in this Coca-Cola, right? Now how can this Coca-Cola be sold to you? I will have to necessarily bottle it and sell it to you. Guys, correct? Now this bottle here is called as a primary packing. Without the bottle, can I sell it? Now can you go to the factory and say, you pour, I will? No, it's not possible. Guys, correct? Hence here, what? The primary packing here, what is the primary packing here? That water bottle is, I mean, the PET bottle, the plastic bottle, that is basically what that comes under primary packing. If it is a primary packing, they are asking you to treat it as a separate line item on the face of cost sheet. This is incurred for the purpose of manufacturing the product. Is that clear? Now, secondary packing, what do you mean by that? Once they bottle it, now for the purpose of ease of distribution, what they do, they put it in cardboard boxes, seal it properly and all. This is called secondary packing. This secondary packing is not required to make the product usable. It is actually meant for distribution purpose. Are you clear with this? From the manufacturer, it will reach the distributor. From distributor, it will reach the wholesaler. From wholesaler, it will reach the retailer. And from him, it will reach you. When you are buying, he will only give you the bottle. Guys, correct? Because these guys deal in bulk quantity, it requires to be packed in a certain way. This is called a secondary packing. Any secondary packing cost should be taken as a part of selling and distribution cost. Is that clear, guys? It is not a part of your production overheads. Is that clear, guys? Or it is not a separate line item. Is that clear, guys? So what is the fourth line item we have seen here? The fourth line item is primary packing cost. So ideally speaking, all these four are originally a part of what? Your production overheads, but institute wants you to mention them on the face of cost sheet. Is that clear, guys? Are you all able to understand? Hence, remove these costs from POH and pluck it separately as line items here. Are you all able to understand? And apart from that, there is something called as less minus credit for recoveries or scrap income. Why do we do that? Very simple. Very simple. Now let us say I incur the cost and I produce 100 units. Out of these 100 units, let us say generally 2 units will always go waste. Is that clear? So effectively, how many units do I get? 98 units. But the cost is incurred with respect to 100 units. Guys, correct? Now these 2 units, what will I do? I will just try to scrap it off. And now if because of scrapping of these 2 units, if I am able to generate any scrap income, you have to reduce it here. Why? Because the cost incurred in respect of 2 units is included here. Guys, correct? Effectively, I get only 98. But I have considered the cost of 100 units, which means the cost of these 2 units are included here. And it's been borne by 98 units. Now, any benefit that you get out of these 2 units should also go on and should also be passed on to this good units. Basically, how will I do that? So, you subtract any benefit or scrap income that you generate out of these units scrapped. So, that also needs to be netted off while arriving at the cost. Is that clear, guys? Are you all able to understand? So, 4 addition, 1 deletions. What are they? Number 1, quality control cost. Number 2, research and development cost. Number 3, administration overheads related to production, AC room in a factory, plant manager. And number 4, primary packing cost, lesser scrap income, that is credit for recoveries. Is that clear, guys? Ideally what we do here is, now in this case, if you notice, guys, so first your stores area, what is it? Opening stock of raw material plus purchases minus closing stock of raw material gives you direct material consumed. You enter into your WAP area. Guys, correct? Direct material plus direct labor plus direct expense weight gives you prime cost. To that add production overheads. You will arrive at gross works cost. Why gross? Add opening WIP minus closing WIP. You arrive at something called as factory cost. This is where institute is changing. Why? 4 addition, 1 deletion, they want you to add. Is that clear, guys? To this factory cost, add 4 addition, 1 deletion. Guys, correct? 4 addition, what are they? Quality control cost, everybody. Research and development cost, administration overheads related to production, primary packing cost, remember, minus scrap income, credit for recoveries. Then you arrive at cost of production. Now you enter into your FG area. Now, in your FG area, what will you have? So, to this cost of production, add opening stock of FG minus closing stock of FG. You will arrive at COGS, cost of goods sold. That is what they are saying. Cost of production, add opening minus closing. You get cost of goods sold. Now, the product moves outside the factory. Guys, correct? No. In the earlier statement approach, now, cost sheet stops here. Am I right, guys? Then your income statement and all they did. Now here they are saying, wait. Don't take income statement. Single statement itself, continue. Now this is the cost incurred till what? Inside your factory. Now the product goes outside the factory. Here continue adding the cost. Outside the factory you have corporate office. So cost incurred in corporate office is called AOH, general. This is not related to production. And then you have sales depot, add SOH. Now you arrive at something called as cost of sales. What do you mean by cost of sales? The total cost incurred, right, to sell this product. Is that clear, guys? It's called as cost of sales. So to this cost of sales, add profit. You will arrive at the sales figure. Is this clear, guys? Only a single statement approach. Very, very simple. Is that clear? Is that clear? Now, one last time, can you tell me the format without looking at it? Yes, come on, tell me, guys. Everybody start. Now, once again, visualize that flow of cost which I have taught you. And just now I told you, easily you can do it. Do not mug up. Come on, everybody. Opening stock of raw material plus purchases minus closing stock gives you direct material consumed. Go to your WIP area. Add direct labor, direct expense gives you prime cost. Add POH, call it as gross works cost. Why gross? We are ready to adjust for WIP stocks. Now, add opening WIP minus closing WIP gives you factory cost. 4 addition, 1 deletion. What are the 4 additions? Quality control cost, R&D, research and development, admin overheads related to production, primary packing cost, less scrap income, credit for recoveries. Now you get something called as cost of production. Enter into your warehouse area. Add opening stock of FG minus closing stock of FG. You get cost of goods sold. Move outside the factory. 2 guys are waiting. Administration overheads, general AOH, then selling and distribution overheads. You arrive at cost of sales. To this add profit, you get your sales. As simple as that, guys. Now you tell me, is there anything to mug up here? Right? No. Half an hour with background logic. We have seen the format of cost sheet itself. Beyond that, what you want? Tell me. This is all it is. I'm telling you, guys, mugging up is not even a sin. It's a crime. You can't mug this up. It's so easy, provided you understand the flow of cost. Is that clear, guys? Yes. Now, one more thing. In exams, they can give you something like this. So prepare a cost sheet clearly stating the cost heads in a cost sheet. Sir, cost heads means what? Don't worry, the subtotal. Prime cost, cost of production, cost of goods sold, cost of sales. These 4 are called as cost heads. The main the subtotals, the main subtotals, these 4 are called as cost heads. We have already seen, no, prime cost is nothing but direct material, direct labor, direct expense. Put together is called prime cost. Guys, correct? Then you have cost of production. Cost of production is what? Factory cost plus 4 addition, 1 deletion. Am I right? COGS is cost of production plus opening FG minus closing FG is COGS. And COGS plus AOH plus SOH gives you cost of sales. That's about it. Are you all able to understand this? Any problem here? No. Are you all able to get this, guys? Yes. Now, one more thing. In this cost sheet, now, there are a few things that you need to know. First of all, guys, this cost sheet is nothing but your trading and P&L account in a statement format. Agreeing with me on this? Yes. Basically, up to your cost of goods sold, you have your trading account. Am I right, guys? And after that, you have your P&L account. Basically, your AOH and SOH. Are you all able to understand this? Yes, that is number 1. Number 2. Now, guys, when I say purchase cost of raw material, what are all the costs I need to consider? All the costs incurred to bring my raw material to my present condition and location. Is that clear, guys? Right? Now, for example, purchase cost, I will take it. Let us say I purchase by paying 100 rupees. Now, let us say 12 rupees is the GST. Now, GST, can I take it as a cost? The answer is, if on this GST, if ITC is allowed, right, input tax credit is allowed, then in that case, it is not a cost. It is actually an asset for you. It is like a cashback treatment. You pay it now and you can adjust it against your outward liability later. Basically, if credit is allowed on GST, it is not a part of cost. If credit is not allowed on GST, yes, then consider this 12 rupee also as a cost. Is that clear? Yes. Next, carriage inwards means what? The transportation cost incurred to bring your raw material to your stores. So that should also be added as a part of raw material. Is that clear, guys? Any problem? Any issues here? No. So in your raw material, all the costs you incur to bring your raw material to your present location should be considered as a part of your raw material cost. Is that clear for everyone? Right. And in case of GST and all, if ITC is not allowed, only then you can take that as a credit. Is that clear, everyone? Yes. Now the next one is regarding direct expenses, direct labor, direct expenses. There is one intricate discussion here. Direct expenses. What forms part of direct expenses? The list is given by ICA. Cost of utilities, stress, power and fuel, right? Power and fuel will come under direct expense. Now guys, what do you mean by direct expenses? It is basically all the costs which can be traced on a per unit level. However, it should not be direct material or direct labor, because we have separate line items for direct material and labor. Is that clear? Example, power and fuel. Now, if I am producing 1000 units, example, let us say every unit requires 1 hour in the machine, which means my machine should be turned on for 1000 hours, which means 1000 hours proportionately there will be a power cost for me. Am I right, guys? Right? So this moves proportionately with respect to the number of units. Am I right, guys? Right? So power and fuel is an example of direct expense. Royalty paid. Example, Maruti is entering into a joint venture agreement with the Suzuki Incorporation. The agreement is for every car produced, let us say Maruti needs to pay Suzuki Incorporation 50,000 rupees. Now, this is a direct cost, no? Yes, it is directly traceable on a per unit level. For every car, pay 50,000. But this is not a material cost, not a labor cost. Hence, I park it under direct expense. Is that clear, guys? Next, there are a few other costs here. Direct hire charges, fee for technical services, then product or service specific drawing designs, product or service specific this is for software. These 4 costs, I'm bracketing it, plugging it under one bucket, and these 4 also are an example of direct expense. How, sir? For example, let us say I am L&T, right? I have multiple projects like Chennai Metro Rail, Hyderabad Metro Rail, Cochin Metro Rail project. 3 projects I have. Now, especially for this Cochin Metro Rail project, I am hiring a specific equipment on big crane, right? Now, and for that I'm paying higher charges. Now, this is exclusively incurred for that job, guys, correct? It is a direct expense. Is that clear? And for that job alone, I invite some technical people, right? Machine related technical people, and I ask for the services because the terrain is different there, right? Hilly terrain and all. Let us say example. Now, for them, I pay some technical services. It is exclusively incurred for that particular job. Am I right? It's a direct expense. Then specific product specific design or drawing. So before I start digging the tunnel, first I will put it on a paper and I will see, fine, this is going to be the design, this is going to be the route map where I'm going to dig the tunnel. Am I right, guys? Right? Now for that, if I am incurring some cost, that is also specific for one particular job. Right? Correct? Right? Then cost of any product or service specific software. If I use a particular software exclusively for that particular project, that is also an example of direct expense. Basically, direct expense means what? It is exclusively incurred per unit or for one particular job. Is that clear, guys? That's what they are saying. Amortized cost of molds, patterns, patents, etc. Molds, patterns and all. For example, now I've given you one example before. Let us say during Ganesh Chaturthi, right? They want to make this clay, right? With the clay, they want to make this, Lord Ganesha's idol. Now, for that, they use a mold, a plastic mold of Lord Ganesha. There, they will put all this clay, and then once they put it like this, that clay will take the shape of that mold, right? That mold, ideally, let us say, with using one mold, they can make 1000 idols. Right? The cost of that mold is, let us say, 1000 rupees. So 1000 divided by 1000. So they will take 1 rupee as the cost per unit. Right? That will be taken as a direct expense. Is that clear, guys? Very strictly speaking, this should not be treated as a direct expense. It's a part of production overheads because it is not directly traceable on a per unit level. But still, Institute is taking a stand that this should also be a part of amortized cost of molds, patterns, patents should also be a part of your direct expense. Is that clear, guys? Are you all able to understand? Yes. Now, one more very important thing that you need to remember. Now, in our subject, we only consider the costs incurred in these 3 locations. Am I right? The cost should be incurred in factory, or it should be incurred in corporate office, or it should be incurred in sales depot. Incurred in factory, basically, it could be direct material, direct labor, or direct expense. Basically, your prime cost component or any other indirect cost incurred in the factory is called as POH, right? But for the face of cost sheet, some 4 addition, 1 deletion alone separated from POH and mention it on the face of cost sheet. You guys are aware of that? Just now we saw. guys, correct? And cost incurred in corporate offices, AOH. Cost incurred in sales depot is SOH. Is that clear, guys? Any cost incurred outside these three locations are not a part of our subject. Example, interest paid on funds borrowed, dividend paid on equity or preference shares, these are never a part of our subject. Why? That's why I said our subject reports only operating profit. It doesn't report final profit. Hence, that's why we call it as EBIT. Is that clear, guys? Earnings before interest and tax. From here you subtract interest, from here you subtract tax, you'll arrive at earnings after tax, earnings before tax or after tax. Is that clear, guys? So we are not bothered about all the other costs. We are only bothered about the three costs incurred in the factory. Is that, I mean, it incurred in these three areas, that is factory, corporate office and sales depot. Is that clear, everyone? Right. Now one more thing I want to tell you, in this connection, I want to tell you something very important. Now bank charges, remember, they are treated as AOH. They are not finance cost. Why? The moment I say bank charges, you think bank is charging me for raising fundraising activity. The bank is actually giving me some money. No, here bank charges refers to, now in the bank I open an account. Now for maintenance of this bank account, right, every year they will charge me, AMC charges, annual maintenance charges, or this SMS charges and all they will do, guys, correct? That is for the purpose of carrying out my operation. That is administrative purpose. I need a bank account. Are you all able to understand? Right? This has nothing to do with the fundraising activity. Are you all able to get this? Right? Hence, bank charges are treated as what? AOH. Are you all able to understand this? Is there any issue here? No. One more thing. If in the question they have given, my supplier gives me a trade discount, you can subtract that. Whereas if they have mentioned supplier is giving me a cash discount should never be considered in our subject. Why? Cash discount is as good as a finance cost. Why, sir? Because why does he give me cash discount? He says if you pay today, you will have to pay full. I mean, if you pay, ideally you can pay after 30 days. Suppose if you pay today itself, I will give you a 2% discount. Example, now he's asking you to pay 30 days early. Now, literally, he's doing this because now if he gets the money for the next 30 days, he can put it in his bank account or somewhere in an investment and earn interest out of that. Guys, correct? Now, how does he motivate you to pay it early? Only by passing on some of that interest to you. Are you all able to understand? Ideally, that comes by way of discount. Hence, ideally speaking, cash discount is a finance cost. It is never considered in our subject. Are you all able to understand? These are some fine points that you need to know. Are you all able to get this, guys? Right? And one more thing, in the question, if they give you conversion cost refers to all the costs incurred in the factory except material cost. Guys, that's why I said it is labor, direct expense, production overheads. In my factory, what are the costs I incur? Direct material, direct labor, direct expense, and all the indirect manufacturing costs is production overheads. Now, conversion cost means what? The cost of converting material into FG, which means what? Material cost will be there, plus I incur the conversion cost. Means what? All other costs incurred in the factory except my material cost, right? Only if I incur the conversion cost on the direct material, it becomes an FG. Are you all able to understand? So in the question, if they are giving you conversion cost, it stands for what? It stands for direct labor plus direct expense plus POH. Is that clear, guys? Now, if the question is silent, maybe direct expense will not be there. In that case, if direct expense is 0, then conversion cost is direct labor plus POH. Are you all able to understand? Is this clear, guys? Now, with this background, let's go and do one question from our solved question bank. So please take your solved question bank. It's there on our website. Please download it. Now, question number 7. Question number 7. Now, let's do this question number 7. It's a very important question. This one's came in your RTP May 24 as well as in September 24 attempt. Now, I am handpicking this sum in this marathon for a specific reason. This is an important question, and this covers a variety of adjustments. That's the reason why I wanted to cover this. So now, let's get started. Shall we, guys? Yes, come on, everyone. Now, P Limited has gathered the cost information from ledgers and other sources for the year ended 31st of December 2023. The information are tabulated as below. They have given a lot of information. Finally, they have given the board meeting is scheduled to be held next week, and you being an associate, the chief controller, cost controller, has been asked to prepare what? Cost sheet. Now, basically, what you need to do with this data, you need to prepare cost sheet. Now, basically, guys, cost sheet format, you guys know. Now, one last time, can you tell me the format of cost sheet? Everybody, make this as a revision. That's all. Come on. Opening stock of raw material plus purchases minus closing stock of raw material gives you direct material consumed. 1 second, wait. Now, when I say purchases, I will include all the costs incurred to bring my raw material from my supplier location to my stores. This will include freight, everything. Are you all able to understand? Yes, very good. Continue. Direct material consumed. Direct labor, direct expense, prime cost. Add production overheads, gross works cost. Add opening WAP minus closing WAP, factory cost. 4 addition, 1 deletion. Quality control, R&D, admin overheads related to production, AC room in a factory. Then primary packing cost, less credit for recovery. Scrap income gives you cost of production. Cost of production. Now you enter into your warehouse area. Add opening FG minus closing FG. You get cost of goods sold. You are going outside the factory also. 2 friends are waiting. AOH, SOH. You add the two, you get cost of sales. Add profit, you arrive at sales. Is that clear? Suppose sales is given, you arrive at cost of sales. Balancing figure will be profit. Are you all able to understand? Excellent. Now, with this background, now guys, I want you all to do this. Of course, we did all these things during our classroom discussion. I mean, during our regular batch. Anyways, now. First, raw material purchase. Where will it come? Raw material purchased, right? Freight inward. Add to raw material purchase cost. There itself you can add it. Next, wages paid to factory workers. Direct wages. Royalty paid for production. Direct expense. Just now we saw. Next, amount paid power and fuel. Direct expense. Now, job charges paid to job worker. Many students struggle in this area. Now, what do you mean by job charges paid to job workers? I will tell you. Now, let us say I am getting on big order to manufacture something, but all my workers are busy with the current workload itself. Now, what I do, I call my another friend who is in the same business. Maybe he has some idle capacity, basically, which means he has his workers are not fully occupied. Now, I tell him, look, boss, I will supply the raw material. You use your workforce to convert this into a finished product and supply it to me. I will sell it to my customer. Is that clear, guys? So literally, my raw material cost is mine. I use his conversion cost, get it converted into FG, and he supplies to me. Now I ask him, look, I will supply the raw material. You don't add raw material cost. Now for you, your duty is what? Convert RM into FG. Correct? Now for this conversion process, per unit, how much will you charge? He says, sir, per unit I will charge you 5 rupees. Now this is a direct cost, traceable on a per unit level. For him to convert every unit, he'll charge me 5 rupees. But this is neither material nor labor. I call it as what? Direct expense. Are you all able to understand? So yes, mark this as important. Area which many students are prone to commit a mistake. Hence we call it as direct expense. Next up, stores and spares consumed. Stores and spares, basically your nuts, bolts, hammers and all these things. Stores and spares. Now it is in the factory but not direct. Any cost incurred in the factory which is not a direct cost is an indirect manufacturing cost. Put it under POH. Is that clear? So this is going to be POH. Next, depreciation of what? Office building. Office means what? Your corporate office. Hence it is AOH. Suppose depreciation on factory office, factory building, POH. Depreciation on sales depot, SOH. Depreciation on delivery vans, SOH. Selling and distribution cost. Is that clear? Next, repairs and maintenance. Now don't immediately come to a conclusion, sir, POH. Where it is incurred, you see that. On plant and machinery. Plant and machinery is located in factory, so POH. Sales office building, SOH. Insurance premium for what? Plant and machinery, POH. Factory building, that is also POH only. Are you all able to understand? Next, expenses paid for quality control check activities. Quality control, separate line item after factory cost. 4 addition, 1 deletion. Very good. Next, R&D cost paid for improvement of production process. Separate line item. Now, another thing, popular area where students commit a mistake is this line item. Expenses paid for pollution control and engineering maintenance. Now, guys, what is this? Now, there are some environmental laws which tell you, now in factory, they can't just like that, they can't release the waste into the environment. Some wastes are let into water bodies, some waste pollution, air pollution and all. Now, environmental laws, what they do, they actually have specific conditions where first these losses, whatever is the waste, that needs to be treated and only then it can be let out in the environment. Guys, correct? Now let us say in a factory, no, where will the pollution happen? In a factory. In a factory, they have a pollution control equipment. Right? Now, any harmful gases will be first treated by this equipment and only certain gases will be released. Not all gases will be released. Is that clear, guys? Now, this equipment, on this equipment, some repair or expenses were incurred. You tell me, where is this equipment located? In the factory. Is it a direct cost? No. Hence, indirect manufacturing cost. Put it under POH. That's all, guys. Are you all able to understand? So, visualize which part of the company this cost is being incurred. Now, if it is corporate office, AOH, if it is sales depot, SOH, if it is incurred in the factory, see whether it is a prime cost component or if it is indirect, put it under POH. Are you clear with this? And certain items of POH alone, separately Institute wants you to mention as 4 addition, 1 deletion. This is about the entire chapter of cost sheet, guys. What is the big deal here? Are you all able to understand? Of course, in our regular batch, we do multiple number of sums where we see different varieties of adjustments and concepts, but this is the base and I wanted to cover most important area in this particular marathon. Next one. Salary paid to sales and marketing managers, treated as SOH. Then salary paid to general manager, AOH. He is a general manager, AOH. Packing cost for primary packing necessary to maintain quantity. What is quality? What is that? Coca-Cola, that bottle. Yes, separate line item. For redistribution, secondary packing, it will come under SOH, selling and distribution cost. Next, fee paid to independent director. Where will the director sit? Corporate office, so AOH. Very good. Performance bonus paid to sales staff. Don't worry about performance bonus or basic or DA. Any salary paid to sales staff is SOH. Any salary paid to your office staff is AOH. Any salary paid to supervisor or indirect workers comes under POH. Any salary paid to your direct workers comes under direct wages. This is the rule. Are you clear with this? So it is location dependent. Are you all able to understand? Next one. Value of stock as on 1st Jan. RMWAP FD. Specific opening stocks are there across the cost sheet, guys. Correct? Right? In your stores area you have opening and closing RM. In your factory shop area you have opening and closing WAP. In your warehouse area you have opening and closing FD. That's about it, right? Oh, and the closing values are also given. Next, amount realized by selling scrap and waste generated during the manufacturing process, 48,000. What is this? So this is a separate line item. What is that? Less credit for recoveries or scrap income. Directly you do this 48,000 and that's about the sum, guys. Nothing beyond that. I have given the solution also here. We discussed it. It is just a matter of plug and play. That's about it. Are you all able to understand this? Is there any issue here? Fine, guys. Right. Now, please go to your library of adjustments and update. So write down new format of cost sheet hyphen components of direct expenses, semicolon, production overheads, semicolon. So components of direct expenses had multiple components. Similarly, POH also had multiple components here. So write on semicolon POH, semicolon QC, semicolon R&D, semicolon admin related to production, semicolon expenses for pollution control, and maintenance, pollution control and maintenance, any other thing, semicolon, scrap income, semicolon, scrap income. Right, guys? That's about this particular question. This can come as a full-fledged 10-mark question. Here, what was the test? Just format of cost sheet where you just had to plug and play. That's about it. Are you all able to understand? Now, I will also discuss a few more things here. 1 second. So, now guys, in this sum, everything was same. I mean, more or less similar. There was one thing that you had to know. I mean, a unique adjustment here. Heat, light and power. How much is the amount? 65,000. Now, generally in the absence of information, you will take the entire amount as incurred in the factory. You will take it as POH. But read the question. They have specifically given. What is that? They have given heat, light and power should be distributed to factory, office and distribution in the ratio of 8:1:1. What is the meaning of this? Which means out of this cost, apportion it in the ratio of 8:1:1. So 8 plus 1 plus 1 is 10. So 8/10 will go to POH. 1/10 will go to AOH. 1/10 of this will go to SOH. Is that clear, guys? That's all. Nothing great here. Are you all able to understand? That is only extra adjustment that you can see here. One more thing, interest on borrowed funds. They have given some amount, 2,000, and outstanding is also another 2,000. What will you do? This amount should not be considered in our subject. Are you clear with this? Now, I think they might have considered this. I'm not sure. They have not considered. Yes, they have said alternatively interest may be added to arrive at cost of sales. No, please ignore interest because it is a finance item, not a part of our subject. Is that clear, guys? I think everything else is easy, not a problem at all. Next one, question number 7B. Now, in this question, there is one unique adjustment. What is it? Now, look at this, guys. Administrative cost for factory and production for others. Admin cost others. This amount is your general AOH. Admin cost for factory and production should be treated as a separate line item. What is a separate line item? Administration cost related to production. As simple as that. Are you all able to understand? Beyond this, there is nothing great in this area. Fine, guys? Are you clear with this? Yes, I think that's about this one as well. The next one, 1 second. Yes, they have mentioned one thing here. This is a past MTP question. Now here, if you see cost of website for online sale, the website maintenance cost, this is meant for sales. Am I right? So this is an SOH. GST credit allowed. This is not a part of your cost at all. Very good. Next, audit and legal fees. Audit fees and all, legal fees. Your board of directors, along with them only auditors will sit and do all the work, right? Of course, they will also come to production area, but generally it's administration related. That's the assumption we take, and it's a valid assumption. Now, there is something here. There is something called guards, right? Guard salary. Guard means what? Security personnel. 20,000 rupees. Now, they have mentioned guard salary should be apportioned between factory, office and distribution in what ratio? 7:2:1. Is that clear? You guys understand? So, don't take this entire amount to POH alone. So, you need to apportion it between these three locations in the ratio of 7:2:1. Is that clear, guys? So, it's partly POH, partly AOH, partly SOH. Is that clear? Yes. Next one. What is it? AMC means annual maintenance charges of CCTV. How much is the AMC cost? 10 lakh rupees. Sir, CCTV cost, any cost incurred on CCTV, where should I take it? It depends on where the CCTV is present. If it is in factory, take it to POH. If it is in your corporate office, take it to AOH. If it is in your sales depot, take it to SOH. Sir, I'm talking about overall all CCTV, sir. Then they have given a meaningful way of apportioning it. 6:2:2. Are you all able to understand? Maybe 60% of the total CCTVs are in the factory, 20% are there in your corporate office, 20% are there in your sales depot. So they are asking you to apportion it this way, apportion this figure. Are you all able to understand? Nothing great here, no? Guys, yes. Now, one more thing. The company paid EPF at the rate of 12% over and above the basic pay. However, the guards will not receive any incentive or EPF. Now, what should you do here? If you look at it, now, guard salary is 20 lakh. So on this 20 lakh, extra PF not applicable. Director's salary 60 lakh. On this, PF will be applicable. Apply how much percent? 12. 12% on this. That will be taken to. AOH, simple. For directors, any kind of salary that you pay, be it your PF, ESI or basic DA, anything, you take it to AOH. Is that clear? Now, many students had this doubt. Sir, except guards, all other employees are entitled to PF. You said directors, correct. Then how about direct employees, sir? On this also, I should apply 12% or not? No. Reason, read this word. Direct employees' wages, allowances, etc. So this indicates that all PF, ESI, everything has already been included in this line item. Once again, don't add 12% on this. Are you all able to understand? Had this not been given, then what you would have done, on this apply 12%, take it to direct expense. Are you all able to, direct wages. Are you all able to understand? Guys, you guys are able to understand? PF paid to direct workers is direct wages. PF paid to if indirect factory workers is POH. PF paid to your directors is AOH. PF paid to sales personnel is SOH. Are you all able to understand? But in this question, you will apply only on director's salary. Guard salary, no. Why? Specifically given. Direct employees, no. Why? Because they have given it includes all allowances. Are you all able to understand? A small observation which can actually make a difference in your answer. Is that clear, guys? Right? I think everything else is quite simple. Not a problem at all. One more thing, hiring of cars attracts GST under RCM at the rate of 5%. RCM means reverse charge mechanism. RCM or FCM, we are not bothered about that. We are only bothered whether credit is allowed. They have mentioned credit is not allowed, 5%. Now, hiring of cars, for whom are they hiring cars? The car is hired for transportation of employees and guests. Have they given anything? This is used exclusively for selling. They have given, where have they given? Where, ma? Hiring of cars is used only for selling and distribution. So, which means 25 lakh is the higher charges. This will come under SOH. On this 25, I need to pay 5% GST. Now, this amount, if it is eligible for credit, I don't consider it as a part of my cost. If it is not eligible for credit, in that case, I will definitely consider it as a part of my cost. Apply that 5%, take it as a cost. Which cost is it? Take it under SOH. This is also SOH, means GST on this figure should go to SOH. Is that clear, guys? Right? And that's about this particular question number 7C. And 7D. One second. Here, this figure, amount paid for purchase of molds and patterns, life is equivalent to 4-year production. Now, what you need to do, this amount divided by 4, you take it under direct expense. Just now we saw, no? Direct expense list we saw, right? So, molds and patterns should be taken to direct expense. Look at this. Under direct expenses, they have taken molds and patterns. 784,000. How did they get the figure of 784,000? How much is it? Yes, 31,36,000 divided by 4, you get the same figure. 7,84,000. Are you all able to understand? Guys, I am just focusing on adjustments. Look at this. Major question number 7 we did fully. Now, A, B, C, D, I am hand picking the tricky areas and doing it. That's all, guys. Beyond this, nothing is there. Are you all able to understand? Guys, any issues, any problem here? No. Next one, job charges paid, we already saw. This is direct expense. Next, guys, this is one really good adjustments which many students miss this out. Now, salary paid to functional managers. Sales manager salary goes to SOH. Finance and accounts manager salary goes to AOH. Production control manager, many students take it to POH. No, this is that separate line item. AC room in a factory, what is that? Administration overheads related to production. So they have silently kept this adjustment. Many students actually commit the mistake. That's the reason what we have done is I have neatly put all these similar questions under a same category, 7A, B, C, D, E, F, whatever it is. So now when you are doing this new format of cost sheet, all the sums with all the adjustments, you can revise it in a single place. That is how this entire question bank has been drafted. Are you all able to get this, guys? Now, this is all about it. Hence, make sure that the production control manager's salary is taken where? To your administration overheads related to production. Is that clear for everyone? Guys, are you all able to understand? Yes, that's one thing. I think beyond that, there's nothing great here. That's about it, guys. That's about it. So that's about the significant chunk of this particular chapter. Of course, there are also certain other aspects, but predominantly, guys, this is one major area in this particular chapter which you definitely need to do. The format of cost sheet, which is very, very important, and based on this format only, right, the entire chapter revolves around. One last time, can you guys tell me the format of cost sheet? And with that, we'll conclude the chapter. Start. Opening stock of raw material plus purchases minus closing stock of raw material, you get direct material consumed, add direct labor, add direct expense, gives you prime cost, add production overheads, gives you gross works cost, add opening WAP minus closing WAP net, you call it as factory cost. Now 4 addition, 1 deletion, what are they? Quality control, QC cost, research and development, R&D cost, admin overheads related to production, AC room in a factory, primary packing cost, minus credit for recovery, scrap income, you arrive at cost of production. Now enter into your FG area. Now here I already have opening stock of FG minus closing stock of FG. I get cost of goods sold. Move outside the factory. 2 friends are waiting. Add administration overheads, general AOH, gen SOH, arrive at cost of sales. To this add profit, arrive at sales. As simple as that. Is that clear, guys? Fine. And with this entire chapter of cost sheet has been properly revised. Right, now let's move on to the next one. So now let's get started with the revision of a brand new chapter called as overheads. Now, before we get started with this chapter, first I want to tell you all that this is a common chapter in your CA Intermediate Paper 4 Cost and Management Accounting and in your CMA Intermediate Paper 8 Cost Accounting. So for both CA and CMA students, this particular chapter is common, exactly the same, right? So for this particular marathon purpose, right, so it is a common marathon or a revision with respect to this chapter, but please be very clear. So we have separate books. I have prepared separate concept decoder as well as solved question bank for CA Intermediate, your cost and management accounting paper 4, as well as for CMA Intermediate. Separate books are prepared, and even in our paid courses, be it your regular or exam oriented classes, the recordings are separate for CA and CMA Intermediate, right? For marathon purpose alone, this particular chapter, which is common, right, I am making it as a common recording. Now on this note, let's get started with this particular chapter overheads. Now guys, our subject, cost and management accounting, costing, right, has 3 objectives. What are the 3 objectives? Number 1, stock valuation profit computation. Number 2, decision making. And number 3, control, right? Now, this particular chapter overheads helps us achieve the first objective, which is stock valuation and profit computation. This is the objective which this overheads chapter helps us achieve. Clear with this, guys? And to put it even more precise, this chapter, the objective of doing this chapter is to calculate the overhead cost per unit. This is what we are going to calculate in this chapter. Sir, why, sir? Now, every unit we know is valued at full manufacturing cost, right? So, manufacturing cost basically represents what? Your direct material, direct labor, direct expenses, right? These three collectively is called as prime cost plus production overhead. If you add up, you get your total manufacturing cost. Now, while the first three components, which are called as prime costs, are readily available on a per unit level. Sir, to manufacture 1 unit of, let us say, a pen, I know how many grams of plastic or refill I need, right? And what is the rate per gram? So which means this direct material cost can be readily available on a per unit level. Direct labor, sir, to produce 1 unit of pen, I need 1 hour of labor. For 1 hour of labor, I pay 5 rupees. So 1 into 5, 5 rupees is the labor cost per unit of output. Direct expense, sir, for every unit of pen, I pay 7 rupees as the royalty. So direct expense is also available. So all these prime cost components are readily available on a per unit level, whereas the production overhead figure is not readily available on a per unit level. It is actually an indirect manufacturing cost which is available only in bulk. For example, your factory rent, repairs and maintenance, depreciation, supervisor salary, etc. These are all costs available in bulk. Clear with this, guys? Now, only if I arrive at the per unit cost, what can I do? So, out of the overall units produced, I can segregate the total manufacturing cost into, right, my cost of goods sold and closing stock. Cost of goods sold will be units sold into the manufacturing cost per unit, and closing stock will be units unsold into manufacturing cost per unit. Or in other words, I need to calculate the manufacturing cost per unit. Only then I can classify my cost into cost of goods sold and closing stock, and only if I do that, I will be able to achieve my objective of stock valuation and profit computation. Or in other words, for me to arrive at the full manufacturing cost, the prime cost components are readily available on a per unit level, whereas the production overheads alone is not available on a per unit level. Hence, the objective of this chapter is to first calculate the overhead cost per unit. If we calculate the overhead cost per unit, anyways my prime cost components are available on a per unit level and waiting for me. To this, if I add the overhead cost per unit, I'll get the full manufacturing cost per unit. With this, I can segregate my overall manufacturing cost into cost of goods sold and closing stock, by which I can achieve my overall objective of stock valuation, profit computation. So first, place yourself right and understand why you are studying this particular chapter, overheads. Clear with this, guys? Now, you might have a question. Sir, perfect, sir, we understood. So the objective of this chapter is to calculate production overheads, overhead cost per unit. By the way, remember, whenever we say overheads in this chapter, overheads represents your production overheads, right? Sir, fine, sir. So we need to calculate the overhead cost per unit. Perfect, sir. Now, for this, why do we need a full-fledged chapter, sir? What do? Take the total overheads divided by the total units, you will get the overhead cost per unit. For this, why do we need a separate chapter called overheads, and why are you actually troubling us with a big chapter? No, it's not that simple. Now, what you are saying is right, provided a company is dealing in only one product. Let us take an example of a company like Titan. Okay. Now, let us say the full overall production overheads incurred by Titan is, let us say, for example, it is going to be 1 lakh rupees. Now, it is incurred in a factory. Now, in this factory, Titan produces, right, watches. Titan also produces, they have this eye gear, that is Titan Eye Plus. They have the spectacles, right? So they have this eye gears. And let us say they also produce, example, I'm telling you, wallets. Now, using the common factory facility where they have incurred 1 lakh rupees, for example, let us say Titan has produced 4,000 watches, right? And 3,000 units of eye gears and let us say they have also produced another 3000 units of wallets. Now, you guys tell me, can I add 4000 watches plus 3000 eye gears plus 3000 wallets, and then I will say, sir, 4000 watches plus 3000 eye gears plus 3000 wallets is equal to 10,000 what? No, or in other words, basically, can you add dissimilar items? 4 donkeys plus 5 monkeys is equal to what? You can't add dissimilar items, right? In this case, you can't say I have produced 10,000 units totally. 1 lakh divided by 10,000 units, it is going to be 10 rupees per unit. Give all these, give all these products 10 rupees share of overheads. It doesn't work like that, because these are all dissimilar items. They cannot be added as such. Are you guys clear with this? So which means I need to have a proper system in which this particular 1 lakh rupees, the bulk figure, needs to be meaningfully apportioned, and I use a procedure called as overheads absorption costing system, through which what happens at the end of the day, I find out what is the overhead cost per unit of watch, what is the overhead cost per unit of eye gear, and what is the overhead cost per unit of wallet. Or in other words, the objective of this chapter is to calculate the overhead cost per unit of each of the type of product the company deals in. Once I do that, then obviously I will be able to achieve the objective of this particular chapter. Are you guys clear with this? So this is the big picture of this particular chapter. Sir, how do we do this, sir? That's why this chapter actually seeing, right, I'm taking the concept decoder of your CA intermediate concept decoder. Separate concept decoder is there for CMA intermediate, but for the purpose of marathon, I'm using CA intermediate concept decoder. Do not worry, whatever we are seeing here is equally applicable even for CMA intermediate students. So look at this. This is what it is. Overheads are the expenditure which cannot be conveniently traced or identified with any particular cost unit, and such expenses are incurred for the output generally and not for a particular work order. And it also represents expenses that have been incurred in providing certain ancillary facility of services which facilitate or make possible the carrying out of the production process. Overheads are incurred not only in the factory but also in administration, selling, distribution. These are separate, it's just an introduction which has been mentioned here. Now, what are the steps involved in overhead absorption costing? The name of the chapter itself is overheads hyphen absorption costing method. So we use a procedure called as absorption costing system. Now guys, basically this entire chapter is divided into 3. This entire chapter, overheads accounting system, is divided into 3. The first one is called as primary distribution. The second phase or the step is called as secondary distribution, and the third phase or the step is called as absorption. Clear with this, guys? So overall there are 3 steps involved in this overhead accounting process: primary distribution, secondary distribution, absorption. Right, that's about it, sir. Now once these 3 steps are over, the absorption costing system, right, gets completed, but there are certain advanced levels of absorption which we will be seeing here. If you notice here, right, we have primary distribution of overheads, then another concept, secondary distribution of overheads, then we have another concept, absorption of overheads. And then once absorption is done, we will also be seeing there are 6 types of absorption rates. This is another learning objective of this chapter. Predetermined rate versus actual absorption rate, then treatment of under or over absorption. Then we will also be seeing blanket rate versus departmental rate, then machine hour rate method. These are all, and of course one more theoretical thing, capacity determination, then core theory topics. Literally whatever I have mentioned here, right, in this particular font, these are all the different concepts we are going to see. Of course, in this revision of this particular chapter, we will also be doing certain numerical problem. All the concepts will also be covered, and with the help of some numerical problems also we will be doing, right, in our regular and fast track, or regular and exam oriented batches. Basically what we will be doing is every single sum we will be doing, right? For marathon purpose, I have handpicked a few questions. I just didn't want to do only the concept part. So concept with some numerical problems. I've handpicked some questions which will represent predominant portion of the concept. That will also be done so that even if you're watching this the day before your exam, you can effectively revise the entire chapter along with me. Now guys, now let me just get back here. Now sir, primary distribution, secondary distribution, absorption. Sir, how does it look like? Quickly, let me just recapitulate this. Now, first of all, the first step is I should identify what are all the line items of production overheads that are available, right? So the first thing I do is maybe some 20-30 line items will be there. For example, I'll be having factory rent, right? Then I'll be having supervisor salary, repairs and maintenance, depreciation on machine, so on like that. I will be having multiple line items, right? Now what will I do with these line items? So first, what will I do is that now I will identify, sir, in our company how many departments are there. For example, let us take an example of Tirupur textile belt, right? We have a textile industry. Let us say in our textile company, right, manufacturing company, I have the following departments. Spinning department, right? I call this as P1. Why P1? I will tell you. Then I have weaving department. This is P2. Then I have printing department. This is P3. Then let us say I also have a factory canteen. So canteen, I call this as S1. And let us say I also have stores, right? I call this as S2. Now, these are all the departments available in my factory. Clear with this, guys? Now, spinning department, what do? I'm a textile company. Basically, raw cotton is there. We spin this cotton and take the threads. Now, once I take out the threads, what will I do? I will weave it and make it into a t-shirt or a pant accordingly. Once the weaving is done, what will we do? Now we give that coloring and printing and all that is done in the third department, P3. So these three are production departments. What do you mean by production departments? The departments through which every product actually passes through. Clear with this, guys? So every product passes through spinning, weaving and printing department. Clear with this, guys? That's why I call it as P1, P2 and P3. Now over and above these production departments, I also have two service departments. What do you mean by service departments? These are the departments which are present in the factory only, but my products will not pass through the service departments. These departments are meant for providing service to the production department. For example, here, canteen. My products will not pass through the canteen, but this canteen will provide food for all the workers working in the production departments. So only if this canteen is there, my production department can run smoothly. Similarly, stores. Stores is basically a place where whatever material they're asking for, the production department are asking for, I will give it to them. Clear with this, guys? So my products don't necessarily pass through them, but stores is required for providing services to the production departments. Clear with this, guys? So now, first, under the first phase of this overhead accounting procedure, which is basically primary distribution, right? So now what we do in primary distribution is that, so every single line item of expense, why do we incur all these line item of expense? Because we have all these departments in our factory. So now, for example, factory rent, I will allocate, I will distribute or apportion it to all the departments of the factory. Next, supervisor salary, once again, apportion it to all the departments of the factory. Repairs and maintenance, apportion it to all the departments of the factory. Depreciation, apportion it to all the departments of the factory, and so on. So every single line item of expense, indirect manufacturing cost, gets apportioned to all the departments of the factory. Clear with this, guys? Why? Because I incur this expense for the benefit of all these departments of the factory. Are you guys clear with this? This procedure of apportioning the line item of expenses to all the departments is called as primary distribution. Sir, why do we do this, sir? Fine, because all these line items of expenses are incurred only for the benefit of departments. Okay, sir, on what basis will I do? For example, factory rent. Use some reasonable basis of apportionment. In a common factory, one area is their factory. Inside this, only all these departments are there, right? On the basis of square feet occupied by each and every department, you apportion the entire factory rent. Clear with this, guys? Sir, supervisor salary, sir. How will I apportion? Maybe on the basis of number of workers working in each of these departments, you apportion. Or in other words, use a reasonable base to allocate or apportionment the respective line item to all the departments of a particular factory. Clear with this, guys? Now, at the end of primary distribution, what will happen? This 20 line items of expenses will vanish and it will turn into just 5 figures. P1 overhead, P2 overhead, P3 overhead, S1 overhead and S2 overhead. So 20 line items will vanish and become into just 5 figures. Clear with this, guys? In our example 5. Now, companies can have 4 production departments and 10 service departments also they can have. It could be anything. In our example which I took, I've just taken 3 production departments and 2 service departments. Clear with this, guys? So, apportioning your line items of indirect manufacturing cost to all the departments of the factory is called as primary distribution. Clear with this, guys? Next, the second phase or the second part of overheads accounting is called as secondary distribution. Now, what do we do in secondary distribution? Now, if you notice here, now P1 department, first all these line items of expenses vanish. Now I have P1 department overheads, P2 department overheads, P3 department overheads and S1 department overheads, S2 department overheads. Now you tell me, this S1 department and S2 departments are basically present only for the purpose of providing services to these 3 production departments? Yes. Hence, what we need to do is, we need to reapportion back the S1 department overheads and S2 department overheads back to the production departments P1, P2, P3. Clear with this, guys? So in the secondary distribution, what we need to do, S1 department and S2 department would have got a share of overheads that needs to be redistributed back to the production departments. Sir, in what ratio, sir? In the ratio of the services provided by each of these service departments. Clear with this, guys? For example, canteen provides services on the ratio of the number of employees working here. Are you guys clear with this? So accordingly, on the basis of services rendered ratio, what I will do is, I will reapportion back the service department overheads to the production department. Are you guys clear with this? So literally here in secondary distribution, what happens? S1 overheads, S2 overheads, these two will be reapportioned back to P1 department, P2 department and P3 department. Are you guys clear with this? So, or in other words, at the end of secondary distribution, now what happens? Beginning I had 5 figures, now these 2 figures will vanish and I will redistribute this back to the production department. So at the end of secondary distribution, in our example, we will only have P1 overheads, P2 overheads and P3 overheads. Clear with this, guys? See how gradually we are reducing the line item, but the total figure will remain to be the same. The sum total of 20 line items here will be equal to the sum total of the 5 line items here at the end of primary distribution. Why? Because all these costs have been apportioned here. The manner of apportionment alone is different. Now, at the beginning of secondary distribution, you have 5 figures. Now, S1 and S2, we are reapportioning it back to the production department. So here, at the end of secondary distribution, the total will continue to be the same, but now it is being shared only by 3 people. Are you guys clear with this? So, secondary distribution, what we do, the secondary department, the service department overheads are reapportioned back to the production department overheads using the services rendered ratio. But remember, secondary distribution, you have different methods of redistributing the the service department overheads back to the production department. What it is at the relevant point of time, I will just tell you. So clearly understand, look at this, in the concept decoder book itself, I've clearly mentioned secondary distribution, that is service department overheads. I need to redistribute it back to my production departments, right? There are broadly three different methods of apportionment of service department overheads back to my production department. What are the three methods? One is called as a direct redistribution method. The second one is called as step ladder method, also popularly called as non-reciprocal method, and the third one is called as reciprocal services method. And under reciprocal services you have three different methods: simultaneous equation, repeated distribution, and trial and error method. Sir, when to use which method, I will come to this, do not worry. We will also be doing numerical problems in the marathon itself. Clear with this, guys? But understand, I'm just giving you guys an overview right now. Secondary distribution. Sir, how do I distribute service department overheads to my production department overheads? Broadly, there are three different methods: your direct redistribution method, step ladder method, and reciprocal services method. And under reciprocal services method, you have three different methods: simultaneous equation method, repeated distribution method, and trial and error method. What are they? When to use which method? I will come back to it with a numerical problem. Right now, I'm just giving you guys an overview. Clear with this, guys? I will do sums for each primary distribution, secondary distribution, absorption, everything. I will be doing some numerical problems in the marathon itself. Nothing to worry about that. Clear with this, guys? So now what happens at the end of secondary distribution? I have all production department overheads, P1, P2, P3 overheads. Clear with this, guys? Now comes the last phase called as absorption. Now in absorption, now what do? The starting point is obviously the secondary distribution, right? So P1, P2, P3 overheads I have. Now, what is the objective of this chapter? I need to calculate the overhead cost per unit of each of the product the company deals in. Let us say this is a textile company, right? So let us say this particular company, deals in, let us say, 4 different products: men's wear, ladies wear, kids wear, and footwear. Let us say the company deals in 4 different types of products: men's wear, ladies wear, kids wear, and footwear. Now on one side I have P1 department overhead bulk figure, P2 department overhead another bulk figure, P3 department overhead bulk figure. Now I need to convert these 3 bulk figures into, so overhead cost per unit of menswear, overhead cost per unit of ladies wear, overhead cost per unit of kids wear, and overhead cost per unit of footwear, right? How do I do this is the subject matter of the third and the last step in this overhead accounting process called as absorption. How do we do that? I will come back to that with one numerical example. Right now I am just giving you guys a broad overview for the purpose of understanding this particular chapter. So primary distribution, what do? We list out all the line items of expenses. Every line item is apportioned to all the departments using what? The ratio of benefits derived, or what we do is we use a reasonable basis, right, to apportion every single line item to all the departments. Clear with this, guys? This is called as primary distribution. After this we do secondary distribution. In secondary distribution, what do? We take the service department overheads and redistribute it back to the production department, right, using services rendered ratio. How do we do it, sir? We have different methods. When to use what method we will be seeing under secondary distribution. And finally, now we have P1, P2, P3 overheads now, and we need to convert this into overhead cost per unit of menswear, ladies wear, kids wear, footwear, all the products the company deals in. How do we do is a subject matter of study in the third step called as absorption. Clear with this, guys? What to do, how to do is what we are going to study and revise in this particular chapter. With this, let's get started with the first step called as primary distribution. Now in primary distribution, what do? List out all the line item of expense, and now we need to apportion all the line item of expense to all the departments using a reasonable basis. Correct? That is what I have mentioned here in our concept decoder. Look at this primary distribution. Here what do? The basis of primary distribution of overheads: rent and other building expenses. Sir, what is the basis of apportionment? Floor area or a particular volume of a department. Right now, let us say labor welfare expenses, supervisor salary, all these things, how will I apportion, sir? Maybe on the basis of number of workers. Sir, please don't mug it up. Sir, should I mug up all these things? Absolutely not. In the question, based on the data given, you know which line item has to be apportioned using which base. Whatever you find reasonable, use that. Clear with this, guys? Right? General overheads, suppose if they have given general overheads, generally, guys, we use direct wages or direct labor hour as the base. Why? If it is general in nature, we always assume human beings are the reason for that expense, so hence we apportion it on the basis of direct wages or direct labor. Depreciation on the basis of capital values of the or the asset value in the respective department. Clear with this, guys? Like this, it just goes on and on. Clear with this, guys? So this is the format of primary distribution, right? Do not worry, we will just go and do a numerical problem. With the help of this numerical problem, right, we will clearly be able to summarize and we will clearly be able to revise and understand the concept of primary distribution. Now please go to your solved question bank of your CA intermediate syllabus, solved question bank of CA intermediate, and please take question number 1. It's on page number 49. So please take question number 1. Now, the following figures are extracted from the accounts of a manufacturing concern, right? From the accounts of a manufacturing concern of the month of September 20x1. What have they given? Particulars. Now, indirect materials in department P1, P2, P3, S1, S2. Department wise, how much is the indirect material cost? This is not a common cost. Department wise, readily they have given us the figures. Clear with this, guys? Generally, what do we do? One line item common cost will be that we need to apportion between multiple departments, but we need not apportion the indirect cost, the indirect materials. Why? This is readily available department wise. Clear with this, guys? Right? This figure is given. Next, indirect wages. This is also readily available, sir. P1 department indirect wages is so much. P2, P3, S1 and S2 department wise indirect wages figure is also available here. Clear with this? So indirect material, indirect wages, these two figures are readily available department wise. Next, power and light. This amount, how much is it? 6,000 rupees. Now, this amount needs to be apportioned between all the departments P1, P2, P3, S1, S2 using a reasonable basis. Insurance on assets 1,000. Common cost needs to be apportioned between all the departments. Rent and rates 2,800. Once again needs to be apportioned. Meal charges 3,000 rupees needs to be apportioned between all departments using some basis. Now depreciation on capital value of assets is 6% per annum. Right? So now look at this. Over and above these line item, they also have depreciation, which is charged at the rate of 6%. From the above information, prepare a primary distribution summary with the following departmental data. First one, what have they given? Now look at this. Look at this. They have given area in square meter. Department wise, how much is the area given? Now, area, for what purpose will we use? Rents and rates 2,800 rupees. It's a common cost incurred for all the departments put together. Now, if we have to apportion this 2,800 rupees of rent and rates to all the departments, now the most reasonable base using which we should apportion the rent cost is going to be area. Clear with this, guys? So area is useful. These figures are useful for apportioning my rent cost. So the rent and rates should be apportioned on the basis of 4:4:3:2:1. Clear with this, guys? That's all it is. Nothing more. Next one. Next. Capital value they have given. So capital value, first, for the purpose of insurance, 1,000 rupees, right? I can use capital value as the base. So 100:120:80:60:40. And also for the purpose of depreciation, capital value can be used. Next one. Kilowatt hours is given. Now for what kilowatt, for what will be used is power and light. Right? Power consumption, power cost and lightings. Kilowatt hours is the basis for apportionment. Next, number of employees is also given here. Number of employees. Now yes, meal charges is available. right? 3,000 rupees the total meal charges incurred for all the departments put together. So department wise, how much, sir? Use number of employees as the base to apportion. 90s to 120s to 30s to 40s to 20. Are you guys clear with this? As simple as that. Now use these bases and apportion. Your line item of expense now gets converted into departmental overheads. P1, P2, P3, S1 and S2. Clear with this, guys? As simple as that. Beyond that, nothing is there in this sum. Now these are common costs. We used some basis to apportion this, right? It is called as apportionment of overheads. Whereas indirect material and indirect wages are readily available on a department level itself. This need not be apportioned. These costs are called as allocated overheads. What do you mean by allocated overheads? If a particular cost, a line item of cost, is readily allocated or available on a department level itself, where you need not use a basis to apportion, it's called as allocated overheads. If it is a common cost that needs to be apportioned between the departments using some reasonable basis, only that is called as apportioned overheads. Clear with this, guys? So these are all some small terminologies which you can actually which you should learn in case they might ask an MCQ or somewhere they might ask. So you should be in a position to answer, or a theory question can also come here. Apportioned overheads means a common cost that needs to be apportioned using some basis, whereas allocated overheads means what? So an overhead which is readily available on, right, departmental level. So now look at this. Look at this. So first, indirect material. So how much was the figure? The total of all these things is available department wise. Just copy paste the figure. So here the template is going to be statement of primary distribution, particulars, total. Should write down the basis also. Then list out all the departments. P1, P2, P3, S1, S2. Now indirect material, indirect wages. These two are direct allocation. Now these figures you just need to copy paste. 950, 1200, 200. 1500, 400, you just need to write down here. 950, 1200, 200, 1500 and 400. Similarly, here for indirect wages, so 900, 1100, 300, 1000 and 650. The 900, 1100, 300, 1000 and 650. Copy paste. So the sum total is being written here. Clear with this, guys? Next one, power and light. So the next line item is going to be what here? Power and light. Now how much is the figure? The figure is going to be 6,000 rupees. Now, on what basis will you apportion? Kilowatt hours. So, kilowatt hours, right? What is the basis of apportionment? 4,000 is to 4,400 is to 1,600 is to 1,500 is to 500. Right, guys? Correct? So, now, literally, what we can do here, we can just remove these zeros. We can just remove these two zeros in the end. So, I can say this is nothing but 40 is to 44 is to 16 is to 5 is to 5, sorry, 15 is to 5, right? So look at this. 40 is to 44 is to 16 is to 15 is to 5, right? Now so basically we need to apportion this 6,000 in this particular ratio, right? How do we do it? First add up all these things. So 40 plus 44 plus 16 plus 15 plus 5. So it comes out to how much? 120, right? Now there is a calculated trick to do this, right? If you've already attended my EVO classes or regular batch, then obviously I would have taught you there. You must be knowing it. If not, if you're learning this for the first time, right, or if you're looking at my lectures for the very first time, there's a calculated trick to do that. Now ideally, guys, if you add this up, how much you get? 120, right? Now literally what will you do? 6,000 divided by 120 into 40 will be P1 share. 6,000 divided by 120 into 44 will be P2 share. 6,000 divided by 120 into 16 will be P3 share, and so on. Now simple. 6,000 divided by 120 is a common figure, right? So take your calculator. 6,000 divided by 120 is equal to how much you get? 50 rupees. Now this 50 rupees needs to be multiplied with 40. You get P1 figure. 50 needs to be multiplied with 44. You get P2 figure. 50 needs to be multiplied with 16, you get P3 figure, and so on. Guys, correct? So now what we need to do, instead of doing 50 into 40 is equal to, once again 50 into 44 is equal to, instead of 50 into 16 is equal to, no need. Common number 50 needs to be multiplied with multiple figures. What you can do is, 50 is there in your calculator. Yes, just click the multiply button twice, into, right? Then what is the first figure? 40. Type 40 and click is equal to, how much you get? 2,000, right? Now don't do anything. What is the second number? 44. Just type 44. That's all. Don't do anything. Just type 44 and click is equal to now. Now you get the second figure. So 50 into 44. So 50 was there. Into you clicked 2 times. 40 is equal to, you get the first figure. Right? Next 44 is equal to, you get the second figure. Next type the third number. 16. 16 is equal to, you get 800. Next 15 is equal to, you get 750. 5 is equal to, you get 250. That's about it. So when you want to multiply a common number with multiple other numbers, just take the common number 50, click into. First number is equal to, you get the answer. Second number is equal to, you get the answer. Third number is equal to, you get the answer. Instead of doing 50 into 40, once again 50 into 44, once again 50 into 16, no need. 50 into 40 is equal to, write down. 44 is equal to, write down. 16 is equal to, write down. 15 is equal to, write down. 5 is equal to, write down. One line, you will get all the numbers. Clear with this, guys? This way, you can save a lot of time in your examination. Clear with this, guys? Right? Now, the third line item. What is it? Insurance on assets. How much is that? 1000 rupees. All right. Now, insurance on assets should be apportioned on the basis of what? Your capital value. So 100 is to 120 is to 80 is to 60 is to 40. So you can just remove 1 0 everywhere. So it's 10 is to 12 is to 8 is to 6 is to 4. Right? So 10 is to 12 is to 8 is to 6 is to 4. So clearly mention. So what is the line item? What is the total? What is the basis for apportionment? And then you can apportion it properly. So 10 plus 12 plus 8 plus 6 plus 4. How much is it? If you add it up, you get 40. Now what do we need to do? So 1000 divided by 40 is equal to, how much you get? 25. So this 25 needs to be multiplied with all these figures. Now 25 into 10 is equal to, you get 250. Next 12 is equal to, you get 300. Then 8 is equal to, you get 200. 6 is equal to, you get 150. 4 is equal to, you get 100. Clear with this, guys? Very simple. In exam, you don't have the luxury of time. Use these small tricks and hacks so that you can maximize your time in your exam. Right? Next one, rents and rates. So what is the figure here? 2800. It should be apportioned on the basis of area. Right? So 4 is to 4 is to 3 is to 2 is to 1. So that's going to be your manner of apportionment. So look at this. It's going to be 4 is to 4 is to 3 is to 2 is to 1. So 4 plus 4 plus 3 plus 2 plus 1. How much is that? 14. Right? So now what do we do? 2800 divided by 14 is equal to, you get 200 into 4 is equal to 800. 4 is equal to 800. 3 is equal to 600. 2 is equal to 400. 1 is equal to 200. Are you guys clear with this? That's about it. So literally, I'm also sharing you the way in which you can do the calculations, use your calculated trick, and save a lot of time in your exam. So all these things are printed and given. Still, I'm doing it and showing it to you so that you will be in a position to actually use these calculated tricks in your exam. Next one is the meal charges of 3000 rupees. It should be apportioned on the basis of number of employees, right? So number of employees, what is the basis here? It's 90 is to 120 is to 30 is to 40 is to 20. Right? That is the basis for apportionment. So, or you can also remove 1 0. It's 9 is to 12 is to 3 is to 4 is to 2. Right, guys? So look at this. Meal charges. It's going to be 9 plus 12 plus 3 plus 4 plus 2. It's going to be 30. Right? So what do we do here? So 3000 divided by 30 is equal to, you get 100 into 90 is equal to 900. Sorry, 9 is equal to 900. 12 is equal to 1200. 3 is equal to 300. 4 is equal to 400 and 2 is equal to 200. Clear with this, guys? Right? Or if you don't want to remove the zeros, you can also do it like that. Absolutely no problem. Clear with this, guys? And finally, do not miss this out. You have depreciation on capital values. So capital value of assets, how much is that? 6% has been given. So now what do we do here? Now very simple. The capital value of all the assets are also given here properly. So now what do we need to do? Be very, very clear, guys. Be very, very clear. Here we are calculating all the overhead costs for the month of September. So 1 month's depreciation is what we need to calculate, or in other words, it is going to be 6%, right, into 1 by 12 into the respective capital value. This is 100,000 means 1 lakh, right? 1,20,000, 80,000, 60,000, 40,000, you will be getting the depreciation. I mean, you'll be getting the depreciation figures. Are you guys clear with this? So how much will be the monthly depreciation? It is going to be 6%, 0.06, right, into 1 by 12, right? You get 0.005 into the respective values of assets. You will arrive at the figure, guys. Correct, right? So how we did 0.06, right, into 1 by 12 is equal to, you get 0.005. Now that amount we need to multiply the respective value. So into 1 lakh, 100 means 100,000. 1 lakh is equal to 500. Here 120,000. So 1,20,000 is equal to 600. 80,000 is equal to, you get 400. 60,000 is equal to, you get 300, and 40,000 is equal to, you get 200. Are you guys clear with this? So literally the depreciation amount for the month of September we have calculated department wise: 500, 600, 400, 300, 200. Look at this: 500, 600, 400, 300, 200. The respective capital value into 6% into 1 by 12, right? If you want, you do it separately also, but that takes a lot of time. That's why I said very simple. So take 6% into 1 by 12. This is a common number that needs to be multiplied with the respective capital values of every single department. You will get the answer. Clear with this, guys? So now if you total it up, P1, P2, P3, S1 and S2, if you total, you will get what? P1 department overheads is how much? 6,300. P2 department overheads is 7,400. P3 department overheads 2,800. S1 department overheads is 4,500, and S2 department overheads is going to be how much? 2,000 rupees. Clear with this, guys? So with this, what has happened? The multiple line items of expenses have lost their identity. In turn, each and every line item has been now converted into P1, P2, P3, S1 and S2 overheads. Are you guys clear with this? So now literally, guys, the total of these line items was how much? 23,000. If you want, you total all these things, this will also be equal to 23,000. 6,300 plus 7,400 plus 2,800 plus 4,500 plus 2,000. If you calculate exactly, this will also be equal to how much? 23,000. Are you guys clear with this? So literally the total overheads will not change. The apportionment is what we are doing here. So at the end of primary distribution, all the line items of your indirect manufacturing costs will lose their identity, and it will now become what? It will now turn into all departmental overheads. Clear with this, guys? That is the objective of primary distribution, successfully achieved. Clear with this, guys? With this, please go and update your library of adjustments. Write down primary distribution. That's all. Please write down primary distribution. That's about it. Clear with this, guys? Now let's move on to the next one. Let's move on to the next question. The next concept, which is secondary distribution. So that is the second concept that we are going to do. Secondary distribution. So what do we do in secondary distribution? Now the service department would have got their share of overheads that needs to be given back to the production departments. Why? The service department exists only for the purpose of providing services to the production departments. So whatever is the share of overheads they receive should be given back to my production departments. Clear with this, guys? Now there are broadly three different methods. Right? In your concept decoder book, I've clearly mentioned at the end of primary distribution, the overheads are totaled for all the departments. The next step is to distribute the service department overheads back to the production departments. This is referred to as secondary distribution, or also known as redistribution of overheads, which can be broadly done under three methods. What are the three methods? The first method is called as direct redistribution method. The second method is called as step ladder method, and the third method is called as reciprocal services method. Under the reciprocal services method, you have three methods: simultaneous equation method, repeated distribution method, and trial and error method. First, these are broadly the three methods. First, you should know, sir, how to do is one thing, but you should know, sir, when to use which method. Many students do not know this. They randomly use any method. No, you have a rule here. there is a rule of when to use what method. That is very, very important for you, and that is always that is purely conceptual. Clear with this, guys? What is this, sir? When should we use what method? Now, the first method called as what? Direct redistribution method. Now, let us say for example, okay, I will write it down here. So broadly, we have three methods of secondary distribution: direct redistribution method, step ladder method, and finally you have reciprocal services method. Under reciprocal services, you have three different methods. That is fine. First, when to use which method, I will tell you. First one, direct redistribution method. Now, when will I use this particular method? Now, let us say, guys, I have three production departments, P1, P2, P3, and I have two service departments, S1 and S2. Let us say S1 is actually a maintenance department, right? And let us say S2 is a stores department. Clear with this, guys? So S1 is what? A maintenance department. S2 is what? A stores department. Clear with this, guys? Now, what will happen here? Now, you guys tell me, maintenance department, what is their job? Wherever machines are located, whenever there is a breakdown in the machine, this particular S1 department will go and do some repairs and maintenance, correct? Or literally, S1 will provide services only to P1, P2, P3, no? Correct? That is, S1 will provide services only to the production department. It will not provide services to S2. Why? Because only where the machines are located, S1 is going to provide the service. Or literally, S1 is going to provide service only to P1, P2, and P3. So there is no service provided by S1 to S2. Guys, are you guys clear with this? Hence, here in this example, this S1 provides services only to the production departments. How about S2? Stores department, what do? They issue raw material. Obviously, S2 also provides services only to P1, P2, P3. Guys, clear with this? S2 will not provide any service to your S1. Why? Because simply here, sir, S2 is a stores department. It provides services only to the production department. That is where the raw material is required. Why will S2 provide any services to S1? Clear with this, guys? Or in other words, in this particular scenario, S1 does not provide any services to S2. S2 also in turn does not provide any services to S1. I mean, S2 does not provide any services to S1. Or in other words, between the service departments, there is no give or take. Clear with this, guys? Or in other words, each of the service departments are meant only for providing services to the production department. In this case, I will use direct method. Are you guys clear with this? Or in other words, when there is no relationship or give or take between two service departments, in this case, I will use my direct redistribution method. Are you guys clear with this? Clear with this, guys? Right? Now, what is the second method? The second method is called as step ladder method, right? Step ladder method. When will I use this second method called as step ladder method? Let us say I have three production departments, P1, P2, P3, and two service departments, S1 and S2. Clear with this, guys? Now, let us say S1, let us say, is maintenance department, and let us say S2 is canteen department. Now, you guys think and answer. S1, anyways, it provides services. All the service departments, they provide services to production departments. I'm not bothered about that. Anyways, it is meant for that. Now, we are more concerned about the relationship between the service departments. Will S1 provide services to S2? No. Why? Sir, it's a maintenance department. I will maintain only where machines are located. In canteen, machine is not located. Clear with this, guys? So S1 does not provide any services to S2. Guys, correct? So S1 does not provide any services to S2. But look at S2. What is S2? Canteen. Now, will S2 provide services to S1? Yes. Why? Canteen. What is the purpose of a canteen? To provide food. Now, will the canteen say, if you are from the maintenance department, I will not provide food? Absolutely not. For all the people in the factory, including the workers working in the maintenance department, the canteen provides food only. Guys, clear with this? So, or in other words, in this case, S2 provides services to S1. Are you all able to understand? In this case, what happens? There is a one-way traffic. I call this as a one-way traffic. There should either be a give or a take between two service departments. Or in other words, look at this here. S2 provides services to S1, but in turn, it does not receive services from S1. Clear with this, guys? So between any two service departments, there should either be a give or a take. Are you guys clear with this? Or in other words, if there is a one-way traffic, traffic, in that case, I will go and use this second method called as step ladder method. How to do, sir? We will be seeing. Don't worry. One numerical problem, all the different variants or the varieties of secondary distribution methods will be seeing. You just listen here right now. So when to use step ladder method? When between any two service departments there is either a give or a take, or in other words, there is a one-way traffic. In that case, you use your step ladder method. Are you guys clear with this? Right now, let me give you a scenario. You guys tell me whether you will use a step ladder method or not. P1, P2, P3 are there. Let us say I have S1, S2, S3. I have three service departments. Here, S1 provides services to S2. Right? S2 provides services to S3. Right? And S3 provides services to S1. Now tell me, is this a case of one-way traffic? And can I use step ladder method? Think and answer. Now, if you notice, some of you might feel, sir, there is no one-way traffic. Why? Look at this, sir. S1. The problem is with S1. S1 provides a service and it also receives service. Two-way traffic is there, sir. So you cannot use this method. No. Understand one thing. Between two service departments, there should either be a give or a take. Here, if you see, S1 provides services to S2, but S1 receives services from a different department, S3. So between S1 and S2, there is only a give. Right? Between S2 and S3, here there is only a give. And between S1 and S3, there is only a take here. S1 is not giving anything. So between any two departments at a time, there should either be a give or a take, or there has to be a one-way traffic between any two service departments at a time. Clear with this, guys? Hence, this is very much a one-way traffic method only. So you can use your step ladder methodology of apportionment or reapportionment of service departments. Guys, are you all clear with this? A very, very trick question here. Clear with this, guys? Are you all able to understand? So step ladder method will be used when you have a one-way traffic. And the third and the last method of secondary distribution is called as reciprocal services method. Reciprocal services method. Now, let us say I have P1, P2, P3. Three departments and three production departments, and S1, S2, two service department. Sir, S1 is, let us say, housekeeping. Right? They will sweep the place, they will do the cleaning and other works. And S2 is, let us say, a canteen department. Now, anyways, S1 provides services to the production departments. S2 also provides services to production departments. Now, I'm not bothered about that. To understand which method to use, we are more concerned about the relationship between the service departments. Now, here, will S1 provide services to S2? Sir, housekeeping, will they go and clean canteen? Yes, they will have to go clean the canteen. And will S2 provide services to S1? Sir, S2 is a canteen department. Will they provide food for the housekeeping staff? Yes. Or in other words, here, there is S1 provides services to S2 and S2 also provides services back to S1. Or in other words, guys, there is a two-way traffic. Correct? There is a true two-way traffic when there is both a give and a take. between two service departments, in this case, you will go on to use your reciprocal services method. Are you guys clear with this? Under reciprocal services method, you have three different methods. You can use any of the three methods. All the three will only give the same result. Are you guys clear with this? So we are in secondary distribution, where the objective is to reapportion the service department overheads back to the production departments. So we have broadly three methods of redistributing back the service department overheads to the production departments. Direct redistribution method, when will you use? When there is ideally a no traffic. No traffic means what? Between the service departments, there is neither a give nor a take, or in other words, all the service departments provide service exclusively to the production departments. Between the service departments, there is no give or a take. Only then you will use direct method. Stepladder method, between the service departments, you take any two service departments at a time, there should either be a give or a take, or in other words, if there is a one-way traffic, use stepladder method. And when there is both a give and a take between two service departments, that's when we use the two-way traffic, which is nothing but your reciprocal services method. Clear with this, guys? Now with this clarity, you can just go around and crack any kind of sum. Look at this. This is what I have mentioned, everything here, whatever we've seen, direct redistribution. So I have clearly condensed and put it here in your study material. It is, everything is there, but it is not in in a very structured format. There are things, it runs into paragraphs. I've neatly condensed and look, put it here. So the day before your exam, you're revising direct redistribution, no traffic. Step ladder, one-way traffic. Reciprocal services, two-way traffic. And under reciprocal services, you have simultaneous repeated distribution, trial and error method. I've quickly explained what is what, but how to do that, clearly we will just go and look at one numerical problem. Are you guys clear with this? So on that note, let's get started with one more numerical problem. This is there in your CA Inter solved question bank. It's in volume 1. So please go and take question number 2. Yes, there are all methods here. Okay, guys. Yes. Now look at this. Question number 2. Now, A Limited manufactures a number of products. It has two production departments, P1 and P2, and the service departments are S1, S2. Clearly, guys, understand, two production and two service departments. The estimated overhead costs for 20x1 and the interdepartmental relationship matrix are as follows. Now, what have they given? Now, look at this. P1, P2, S1, S2. Four departments overall, two production, two service. S1, service provided by. S1 provides services to P1, P2 as well as S2. Clear with this, guys? What is the ratio of providing service? Sir, overall, sir, S1 department, right? Overall, it provides 40% of its service to department P1, 50% of its service to department P2, and the balance 10% service it provides to whom? Department S2. Clear with this, guys? Now, how about S2? S2 provides 50% of its service to P1, 30% to P2, and 20% of its service to S1. Now wait. S1, it provides services to S2? Yes, sir. 10% of its overall services is being provided to S2. How about S2? Does it provide services to S1? Yes, sir. 20% of the entire department S2 is actually provided. I'm providing service to actually S1. Or in other words, S1 provides services to S2. S2 also provides services to S1. So clearly there is both a give and a take. This is a clear case of two-way traffic. Ideally, this sum you need to redistribute back the secondary distribution. The secondary distribution, that is a service department overheads, need to be redistributed back to the production department using which method? Reciprocal services method. Under the reciprocal services method, you have three methods. You have your simultaneous equation method, or your repeated distribution method, or your trial and error method. Using any of these three methods only, you should apportion, or in other words, this is a clear-cut case of two-way traffic. Right, so you should only use reciprocal services method. Right, now what are they given? Estimated overheads. P1 department overheads, P2 department overheads, S1 department overheads, S2 department overheads. Or in other words, they themselves have done the primary distribution here. Sir, multiple line items have now been converted into all department overheads. So the primary distribution is actually the starting point for secondary distribution. So right now they have given all these departments. Right now they have given what? They have given all departmental costs, right? Now P1, P2, S1 and S2 has been given. What is the objective here? After we conduct the secondary distribution, now S1 and S2 should vanish and I should redistribute it back to P1 and P2. At the end of secondary distribution, I should have only P1 department overhead and P2 department overhead. S1 and S2 should vanish. Correct? That is the objective of secondary distribution. Whatever is the service department overheads should be redistributed back to my production departments. Now, ideally, this sum needs to be solved under what method? Under reciprocal services method. Now, look what they've asked. You are required to calculate the overhead cost for P1 and P2. Or in other words, at the end of secondary distribution, you only have production department overheads, right? Now, using first direct apportionment or direct redistribution method. So first, sir, this is a two-way traffic, sir. Direct method I will use only when there is no traffic. You are absolutely right. But still they have asked you, despite it is a two-way traffic question, they have still asked you to use direct method, right? Since it is asked, we will do. Single question, all the methods are covered. How to do it, we will be seeing. Next, using stepladder method. And stepladder method by apportioning S1 department overheads first, and number 2 by apportioning S2 department overheads first. How to do that, I will tell you. Next one, reciprocal services method. And under reciprocal services method, you literally have repeated distribution, simultaneous equation, trial and error. So ideally, guys, these three come under your reciprocal distribution method. I mean, your reciprocal services method. Ideally, these are all subcategories of reciprocal services method. Clear with this, guys? Or in other words, one question, all the different varieties of your secondary distribution will be done here. Shall we get started? Yes. First one, guys, direct redistribution or direct apportionment method. What should you do? Very simple. Now, the starting point is what? Primary distribution summary. Sir, how much is the departmental overhead, sir? 7,000, 6,000, 18,000, 8,000. So 7,000, 6,000, 18,000, 8,000. Clear with this, guys? P1, P2, S1, S2. Now, what they are saying, sir, ideally, when will I use, sir? When will I use my this one, direct redistribution method? When there is no traffic between your S1 and S2. That is, there is no give or take between your service departments. Only then I will be using direct redistribution method. In this case, what we need to do, sir, S1, what is the cost? 18,000. Now we are saying, look, direct redistribution method, we only assume in direct redistribution method, we only follow it when my service departments exclusively provide services to production departments. So here, sir, S1, sir, it has provided its services. Overall, this 18,000 ideally should be apportioned in the ratio of 40:50:10, right? But here, since we are doing this sum under direct method, we will just ignore the inter-service. The services provided between the service departments will be ignored. Why? Because in direct method, there is no traffic, no? So forget this. Ideally, what we need to do, sir, 18,000 rupees is the departmental overheads of department S1. Apportion it between P1 and P2 in the ratio of 40:50. As simple as that. Why? Because direct method is used only when there is no give or take between the service departments. Clear with this, guys? Sir, this is ideally a two-way traffic sum. Yes, this is a two-way traffic sum. Still, they have asked you to actually do the sum under direct method. In that case, you should ignore the services provided between the service departments. Are you guys clear with this? Or in other words, this 18,000 needs to be apportioned in the ratio of 40:50. Right? So what happens here? Look at this. 18,000 you subtract, apportion it in the ratio of 40:50. So 4 plus 5 is 9. So 18,000 divided by 9 is equal to, you get 2,000 into 4 is equal to, you get second. So 18,000 divided by 9 is equal to, you get 2,000 into 4 is equal to 8,000. 5 is equal to 10,000. So what we did here, so S1, we removed 18,000 and distributed it between P1 and P2 in the ratio of 4:5. Now what has happened? S1 department overhead has become 0. Clear with this, guys? Next, go on to S2. How much is S2 department overheads? 8,000. Now apportion it between P1 and P2 in the ratio of 50:30. This is to be ignored. Why? We are using direct method, and under direct method, the services provided between the service department should not be considered. Clear with this, guys? So apportion this in the ratio of 50:30. Clear with this, guys? So here, what do we do here? 8,000 minus 8,000 we need to do should be apportion the ratio of 50 is to 30, 5 is to 3. So 8,000 divided by 8 is equal to, you get 1000 into 5 is equal to 5,000, 3 is equal to 3,000. So now at the end of the secondary distribution, what happens? S1 also becomes 0, S2 also becomes 0, and P1 and P2 will now get the share as well. So P1 value will be 7,000 plus 8,000 plus 5,000. How much is that going to be? 20,000 rupees. And how much is P2? 6,000 plus 10,000 plus 3,000. It is going to be 19,000 rupees. So at the end of secondary distribution, what has happened? The service department overheads, service departments have lost their identity and they have become 0, and whatever was the service department overheads have been redistributed back to the production departments. Are you guys clear with this? That was the objective of secondary distribution, and we have completely done it. So direct method is fairly simple. What you need to do, apportion your service department overheads between the production departments only. If there is a service between the service departments, ignore it and directly do it. Are you guys clear with this? As simple as that. Next one, sir. What is the next one? The next one is called as step ladder method. Now, what have they asked? First apportion S1 department cost. Very simple. P1, P2, S1, S2. Clear with this, guys? So now, what do we do? First apportion what? S1 department cost first. So first, sir, I'm going to apportion, right? S1 department. How much is S1 department cost? 18,000. You reduce it from S1. Right now it needs to be S1 provided services to whom? P1, P2 as well as S2, correct? So it provides services to P1, P2 and S2. But before that, first you tell me, when will we use step ladder method? When there is only a give or a take, correct? Or in other words, there is a one-way traffic, only then we will be using step ladder method. Clear with this, guys? Now they have asked us to apportion S1 cost first, which means first S1, sir, I am reducing it. What will we do? So S1 should be apportioned between P1, P2, P3 in the ratio of 40 is to 50 is to 10. Clear with this, guys? Let's go and do it. Right? So 40 is to 50 is to 10. So 18,000 divided by, so 40 plus 50 plus 10, literally you get 100. So 18,000 divided by 100 is equal to 180 into 40 is equal to 7,200, 50 is equal to 9,000, 10 is equal to 1800. Clear with this, guys? Now what has happened? S1 became 0. Now what happened to S2? S2 had its own share of 8,000 plus now it's got how much? 9,800 rupees. I mean 1,800 from S1. Now what do I do? Totally from S2 I need to apportion how much? 9,800 rupees. Guys, clear with this? Clear with this? Now I will reduce 9,800. Now, guys, understand this is very important. Now, S2, right? This is S2. Now, once again, actually seeing S2 provides services to P1, P2 as well as to S1. Guys, correct? But in step ladder method, what do? We follow step ladder only when, right, there is a give or a take. So S1 has already received from S2 has already received something from S1, so it cannot provide back to S1, guys, correct? If you are following step ladder, so what we do, since we apportioned S1 department overheads first, now when we are redistributing S2 department overheads, we will ignore this 20%. Why, sir? Because S2 has received from S1. If you are following step ladder, you can only receive or give. Guys, correct? Since I have received, I will not give anything, so I will ignore this. So whatever is the share of S2 will now be redistributed back to P1 and P2 in the ratio of 5 is to 3. Are you guys clear with this? Why do we do this? Because ideally speaking, guys, this is a two-way traffic sum, but still they asked us to follow one-way traffic. Hence, first we apportion to S1, but S2 received from S1, so it can't give back anything to S1. That's why this 20% now we need to ignore. And whatever is the balance in S2 needs to be apportioned between P1 and P2 in the ratio of 5 is to 3. Clear with this, guys? That's what we are going to do. So now here we have 9,800. It needs to be apportioned between P1 and P2 in the ratio of 5 is to 3. So 9,800 divided by 8 is equal to, so 5 plus 3 is 8, 1225 into 5 is equal to 6125, 3 is equal to 9635. So now what happens at the end of S1, at the end of secondary distribution, S1 18 minus 18 0, S2 8000 plus 1800, right? So you get what? Totally 9800. minus 9,800. So this becomes 0. So S1 and S2 becomes 0. And P1 gets a value of how much? 7,000 plus 7,200 plus 6,125. You get 20,325. S2 6,000 plus 9,000 plus 3,675. You get 18,675. This is the value of P2. Are you guys clear with this? So now we have P1 and P2 value only, which means at the end of secondary distribution, the service departments will lose their identity and all the costs are given to production departments. Now, the same question, now we will do it once again under step ladder method, but this time we will apportion S2 first. Clear with this, guys? Now what happens? P1, P2, S1, S2, the primary distribution summary is available. First, you distribute what? S2, right? So first we need to distribute S2 and then only we will distribute S1. So now first let us distribute S2. What will happen here? Sir, S2 we are going to distribute, right? Which means S2 provides services in what ratio? To P1, P2 as well as S1 in the ratio of 50:30:20. So right, so 5:3:2 is the ratio. Now what do I do? 8,000 rupees I have. Reduce this 8,000 and redistribute it to P1, P2 as well as S1 in the ratio of 5:3:2. Right? So how much you get here? 5 plus 3 plus 2 is 10. So 8,000 divided by 10 into 5 is equal to 4,000. 3 is equal to 2,400. 2 is equal to 1,600 rupees. Are you guys clear with this? So the S2's cost has been apportioned between P1, P2 and S1. Now I have to distribute S1's share of overheads. S1, how much is it going to be? 18,000, it had its own share. Plus now it has received 1,600 rupees, which means overall it would have received 19,600 rupees. So this 19,600 rupees needs to be apportioned. But since I have already received from S2, now I cannot give back anything to S2. Why? Because I'm following one-way traffic method, which is step ladder method. Hence what we do here, S1 now, so though it provides services to P1, P2 as well as S2, we ignore this because since we are following step ladder method, I can either give or take. I have already taken from S2, so I cannot give anything to S2. So whatever is the balance lying in S1 needs to be apportioned only between P1 and P2 in the ratio of 40:50 or 4:5. So now this 19,600 should be apportioned between P1 and P2 in the ratio of 4:5. So 19,600. So 4 plus 5 is 9. So divided by 9 is equal to, you get something, 2177.7777 into 4 is equal to, you get 8,711. And 5 is equal to, you get 10,888.8888, or it's rounded off to 10,889. Clear with this, guys, right? And with that, S1 and S2 will be 0, and literally you will only get your P1 and P2 value. But remember, the answers will be different. So why our answers are different? Ideally, guys, this sum should not be solved under your step ladder method, only because this ideally is a two-way traffic. But a two-way traffic sum, we are solving it under a one-way traffic method. Hence, we had to take this particular assumption. First, if you apportion S1, what will happen? Because the second apportionment we are ignoring this S1 value. Here, if you are apportioning S2 first, right? Here we are actually, here we are ignoring S1's services provided to S2. Guys, correct? So that needs to be ignored. Whatever you are actually apportioning next, the last, that needs to be actually ignored for the purpose of calculation here. Clear with this, guys? All these things are happening here because a two-way traffic sum is being solved under one-way traffic. But here, ideally, I wanted to do a single sum that covers everything and show it to you how this works. Are you guys clear with this? And one more very important thing, it's called a step ladder because, can you see this step here? Right? As and when you apportion, look at this. Can you see the step? It forms a step as and when you keep apportioning, and that's the reason why this method is called as step ladder method. Now, let's go on to the third and the most important part of this particular question, which is reciprocal services method. Guys, what do you mean by reciprocal services method? Basically, when there is both a give and a take, reciprocity as they call it, right? You use reciprocal services method. Now, under reciprocal services method, you have repeated distribution, simultaneous equation, trial and error method. There are three different methods under reciprocal services method. In this question, is there a give and a take? Yes. Is there a one-way traffic, two-way traffic, or no traffic? There is a two-way traffic. So the correct method is going to be reciprocal services method. So reciprocal services method can be solved under either of these three methods, right? All the three methods will give you the correct answer only, right guys? Now let's go and solve this particular question under the first method of reciprocal services, which is called as repeated distribution method. Shall we go and solve it? Yes. Let's get started here. Let's get started. Repeated distribution method. How do we do it? Very simple, guys. P1, P2, S1, S2. Right? We have these things. Now, this is the question given. This is given in the question. Primary distribution summary is already given. 7,000, 6,000, 18,000, 8,000. These figures are all given in the question. Now, first, what do we do? Now, look at this. Sir, S1 provides services to P1, P2 and S2 in the ratio of 40:50:10. Correct? It provides services in the ratio of 40:50:10. Right. First, apportion the costs of all the cost of S1 department overhead should be apportioned. Remove it and distribute it back to these three guys in the ratio of 40:50:10. Let's do that first. So first, what we need to do here. So this 18,000 we need to subtract and apportion in the ratio of 4:5:1. So 4 plus 5 plus 1 is going to be how much? 10. So 18,000 divided by 10 is going to be 1800 into 4 is equal to 7,200. Right? 5 is equal to 9,000 and 1 is equal to 1800. Clear with this, guys? I have distributed my entire amount of S1 department overheads. So literally 18,000 minus 18,000, S1 value becomes 0. Right? I have given my share to P1, P2 and P3. Clear with this, guys? Now let's go to S2. Now what happens with S2? Sir, S2 provides services to P1, P2 as well as S1 in the ratio of 50:30:20. Right? This is what happens here. So 5:3:2. Now what we need to do, S2 department, it had 8,000 plus now it has received 1,800. Overall it has how much? 9,800 rupees here. Clear with this, guys? So this 9,800 needs to be apportioned between P1, P2 as well as S1 in what ratio? In the ratio of 5:3:2. So 5 plus 3 plus 2 is 10. So 9,800 divided by 10 gives you 980 into 5 is equal to 4,900, 3 is equal to 2,940, 2 is equal to 1,960. So which means what happens at this point, what happens? S2, it had totally 9,800. It gave away the entire 9,800. S2 became 0. Now if you notice what happened, S1 was earlier 0, 18 minus 18. It was happy. But now once again it got a share of how much? 1,960. Clear with this, guys? Right? S1 was happy that it gave away all its cost to the other departments, but once again it has received back from a share from S2. Why? Because there is both a give and a take. Right? So S1 gave to S2 initially. Now S2 gave something back to S1. Clear with this, guys? Now S2 value is 0, but S1 got a share of how much? 1,960. Are you guys clear with this? Now what do we need to do? Sir, we can't have this 1,960. Once again, repeat the distribution. Right? Once again, sir, S1 now got a balance. Redistribute it once again to all the departments in the ratio of 4:5:1. That is your services rendered ratio. So once again, redistribute 1,960 in the ratio of 4:5:7. This is why it's called as repeated distribution method. Clear with this, guys? So 1,960 divided by 10 is equal to 196 into 4 is equal to 484, 784. 5 is equal to 980, 1 is equal to 196. So now what happened at this point? Now whatever I had with me, S2, S1, 1960, I redistributed back. Now I became 0. But what happened? Now once again, S2 got a share. S2 was 0. Now it got how much? 196 rupees. Guys, clear with this? Now what should I do? Sir, since S2 got 196, once again repeat the distribution back. S2 provides services once again to P1, P2 and S1 in what ratio? 5:3:2. So once again, apportion this 196 rupees back to each of the other three departments in the ratio of 5:3:2. So 196 divided by 10 is equal to 19.6 into 5 is equal to 98 3 is equal to 58.8 rounded off to 59. 2 is equal to 39.2 rounded off to 39. Now what happened? S2 became 0, but S1 got a share of how much? 3.9 rupees, 39 rupees. Once again, this 39 rupees needs to be apportioned. So S1 provides services to P1, P2 as well as S2. Right? So in what ratio? 4 is to 5 is to 1. Go ahead, repeat the distribution. That's why the method is called as repeated distribution. You need to keep on doing it, right, till you arrive at a minimum value. It can never be 0 because there will always be a give and a take. So I will always, there is a loop here. S1 gives services to S2, it will receive something back. Once again, that you should give it back to S2. Once again, you'll receive something back. It keeps on going till the amount is very small. Once it becomes small, then you can give all the amount to the production departments and close it. Now, in this case, 39 rupees, apportion it back. In the ratio of 4 is to 5 is to 1, 4 plus 5 is 1 is going to be 10 rupees. So, 39 divided by 10 is going to be 3.9 into 4 is equal to 15.6 rounded off to 16 rupees. 5 is equal to 19.5, right? They have kept it as 19 rupees. And then 1 is equal to 3.9. They have rounded off to 4 rupees. Clear with this, guys? So now, finally, S2 got a share of 4 rupees. Now, what they did, so this 4 they subtracted and they are giving it to P1 and P2 equally. Meager amount. Or if you want to, once again, one more iteration you can do. S2, sir, it will also provide services in the ratio of 5 is to 3 is to 2. Once again, you do. If you do that literally, so 5 into 2 by 10, if you do, 0.8 is what you will get as S1's share. That anyways, you can give it off to the production department. Finally, if the amount is small, it can be apportioned between your production departments and you can close it off. Right? Are you guys clear with this? So should I do it equally? No, if you want, you can also apportion it in the ratio of 5 is to 3 and close it off. This rounding off is not a problem. It will not take much of a difference. So finally, what happens in the last part, when the amount is minimum, we actually close it off between the production departments. We don't give anything a share because it is a meager amount. So now what happens? S1 and S2 become 0, right? If you notice here, 8,000 plus 1,800, so 9,800 minus 9,800, it became 0. But once again it got 196 and that 196 was apportioned back. Once again it got 4 and this 4 was apportioned back. Literally it is 0. Similarly here, 18,000 I had, I gave 18,000, became 0. Once again I received a 1960 that I gave back. Right, it became 0. I received 39. Once again, I gave back 39. So literally, there was a give and a take, give and a take, give and a take, and we kept on doing this repeated distribution. So literally, in the process, P1 and P2 got getting something or the other. Guys, clear with this, guys. So now overall, if you see, P1's share of overheads was 20,000 rupees. P2's share of overheads was 19,000 rupees. S1 and S2 became 0. This is called as repeated distribution method. So ideally, the correct way of doing this particular sum with a two-way traffic is only reciprocal services method. And under the banner of reciprocal services method, the first method we saw is repeated distribution method. Simple. Keep on repeating the distribution till the service department overheads become minimum. Once it becomes minimum, apportion everything to your production department and close it off, round off. Clear with this, guys? Are you all able to understand this? So now P1 department share is 20,000, P2 department share is 19,000, S1 and S2 each are left with how much? Nil and nil. Are you guys clear with this? This is called as your repeated distribution method. The next method is called as simultaneous equation method. The next method is called as what? Simultaneous equation method. In my opinion, this is the best method to be followed because it saves a lot of time in your exam. Repeated distribution is also the correct. It gives the same answer only, but it takes a lot of time in your exam. Now, simultaneous equation method. How do you do this? First, it's a three-step approach. Step number 1, forming of equation. Now, guys, if you see, originally as per the secondary distribution, primary distribution summary, S1 department had a share of how much? 18,000 rupees, the S1 department overheads. S2 department overheads is how much? 8,000 rupees. Clear with this, guys? Right? Now, let us say S1 departments, let us keep it as X. S2 department, let us keep it as Y. Right? So, S1, let S1 be X and let S2 be equal to Y. This is for the purpose of framing an equation. Now, guys, think and answer. Can I say X, that is S1 department's total overheads, how much is it? Can I say it is going to be 18,000 rupees plus it will receive 20% of Y. that is S2 department overheads, guys, correct? Or S1 department's total overhead is going to be its own share 18,000 plus the share it's going to receive from Y, so 18,000 plus 0.2 Y. Guys, clear with this, right? So can I say here S1 is what? X is equal to 18,000 plus 0.2 of Y. Guys, agreeing with me? Because I have my own share. Plus, I don't know, I will also be receiving 20% of Y. Okay, perfect. So then what is Y, sir? Y is equal to its own share, 8,000, plus it will receive 10% of S1. So 0.1x. Guys, are you clear with this? So here literally, sir, what is S2 department? Y's overheads. How much is it? Sir, its own share 8,000 plus it receives 10% of S1 department overheads. Are you clear with this? So now for me to get the X value, I need to know the Y value. Okay, so how much is the Y value? For me to know the Y value, I need to know the X value, or in other words, it is a loop. That is why we kept on doing this repeated distribution. Now, instead of wasting the time, if we frame the equation and solve it, we will now be able to clearly arrive at how much is the X value, how much is the Y value. Directly, it can be apportioned. Sir, how to do that? I will tell you. Do not worry about it, right? So now, these two are the equations which you first need to form. So X is equal to 18,000 plus 0.2 Y. Y is equal to 8,000 plus 0.1 X. Are you guys clear with this? So the first step here is to frame the equation. X is equal to 18,000 plus 0.2 Y and Y is equal to 8,000 plus 0.1 X. Are you guys clear with this? Now, sir, how can I solve the equation, sir? Simple. This is the first equation. Let us take this as the first equation and let us take this as the second equation. Now simple, X is equal to what? 18,000 plus 0.2 Y, correct? Right? And Y is equal to what? 8,000 plus 0.10 X. Guys, now instead of X, I will rewrite, sir, X is equal to anyway, sir, 18,000 plus 0.2 Y only, no, sir. So I will substitute the equation 1 in equation 2. If you want, you can also substitute equation 2 in equation 1. So equation 2 is what? Y is equal to 8,000 plus 0.1 X, right? Instead of X, I will know that X is equal to 18,000 plus 0.2 Y. So instead of X in the second equation, replace it with 18,000 plus 0.2 Y. So here, so the second equation will look like Y is equal to 8,000 plus 0.1 of X. No, instead of X, I will write it as 18,000 plus 0.2 Y. Are you guys clear with this? So now Y is equal to 8,000 plus, so 0.1 into 18,000 becomes 1800 and 0.1 into 0.2, it becomes how much? 0.02 Y. Are you guys clear with this? So literally Y is equal to 8,000 plus 1800 plus 0.02 Y. So the entire equation is written in terms of Y. So now solve and arrive at the Y value. So literally guys, 8,000 plus 1800 gives you 9,800, right? And Y you have here, 0.02 Y you have here. So 0.02, if it goes to the other side, it becomes minus 0.02. So Y minus 0.02 Y, or 1 minus 0.02 becomes 0.98. So 0.98 Y is equal to 9,800, or Y is equal to 9,800 divided by 0.98. You get how much? 10,000 rupees. So Y is equal to 10,000. Clear? Now we got this value. Sir, what is this 10,000? Wait, I will tell you. Don't worry. Right? So Y is equal to 10,000. Now, how much is X? X is equal to 18,000 plus 0.2 of Y. Now, anyways, Y value we got. So, X is equal to 18,000 plus 0.2 of 10,000. So, 0.2 of 10,000 is 2,000. So, X is equal to 18,000 plus 2,000, which is equal to 20,000 rupees. So, literally, we got Y value 10,000, X value 20,000. Sir, with this, what should I do, sir? Now go to the last and the final step, apportionment. Step 1, forming the equation. Step 2, solving the equation. Step 3, now go to the apportionment sheet. Simple, guys. Now what do we do? P1, P2, S1, S2, primary distribution summary, given figures. Now first, S1, you need to distribute, right? S1 provides services in the ratio of 4:5:1. Now here, how much is the S1 value? 18,000. You don't distribute 18,000. You distribute, what is the X value we found out? 20,000. That 20,000 you now need to distribute in the ratio of 4:5:1. How much is it? So 20,000, 4 plus 5 plus 1 is 10, divided by 10 is equal to 2,000, into 4 is equal to 10,000, 8,000, 5 is equal to 10,000, 1 is equal to 2,000. So you distribute this 20,000 rupees, right, between P1, P2 and S2. Clear with this, guys? Next, S2. Now, what is the S2 value? 10,000 rupees. Now put this 10,000. Now actually seeing 8,000 plus 2,000, exactly it is matching with 10,000, right? How? That's why by doing this equation, we predicted that, look, Y is 10,000 means what? It has its own share of 8,000 plus it will be receiving 2,000 from X. We predicted. How? Mathematically we calculated with the equations. That is the Y value. Clear with this, guys? So now we are going to distribute 10,000 and apportion to the ratio of 5:3:2. So that's nothing but 5,000, 3,000 and 2,000. Clear with this, guys? Now look at this. S1, it originally has how much? 18,000 plus it receives 2,000 rupees from S2 in future. Guys, correct? Now this 2,000 rupees which it is going to receive from S2 in future was already predicted using these equations, and that's why initially itself we actually distributed how much, guys? 20,000 rupees. Are you all able to understand? So overall S1 we had to distribute 20,000. Why? It has its own share of 18 plus this equation. Mathematically it predicted that it is going to receive 2,000 from S2. This way we calculated and straight away one apportionment we actually distributed S1 and S2 and arrived at the P1 P2 value. Are you guys clear with this? How much is P1 and how much is P2? 20 and 19,000. This was the same answer we got under repeated distribution method, or in other words, guys, very simple. Here X is equal to 20,000, no, right? What is this 20,000, sir? I will tell you. This 20,000 is nothing but very simple. Look at this, or let me just take Y. Y is equal to how much? 10,000. This 10,000 is nothing but, look at this, the sum total of all the repeated distributions here. S2, 9,800 plus 194 plus 4. I did 3 distributions, right? Right? So 9,800 plus 196 plus 4. How much is it coming out to? 10,000 rupees. So totally, look, first I distributed 9,800. I received back something. Once again, that 196 I redistributed. Once again, I received 4. That 4 rupees I redistributed back again. Guys, clear with this? So whatever I'm going to redistribute it, get back, and once again redistribute and get back. All these things were predicted through this equation, and directly it said, look, you have 8,000 plus totally you are going to get 2,000 from your S1. So overall you need to distribute 10,000. Directly you distribute. Similarly, X value is 20,000. How did you get this 20,000? Look at this. Look at this. 18,000 first we distributed, right? Then we distributed 1960. Then we distributed 39. Add up 18,000 plus 1960 plus 39. How much you get? 19,999. This 1 rupee round off for that was there. Actually, this is 20,000. Or in other words, this equation, simultaneous equation method predicted, look, S1, I know you have 18,000 rupees as your share, but in future you will be receiving something from S2 also. I am factoring everything in no account and clearly telling you, look, totally 20,000 is the amount you are going to apportion as a whole. Right now itself you distribute it in a single line item. Are you guys clear with this? So what is going to be the total amount that I have to redistribute is what we calculate with the equations, and a single shot we actually go ahead and do the apportionment. Are you guys clear with this? And that is exactly what your simultaneous equation method does for you. Clear with this, guys? Answer is going to be exactly the same. Clear with this, guys? So that is all about it, right? Now this trial and error method is actually one mocha method, right? It is not a very great method and all. Why? Because this is nothing but a mixture of your repeated distribution method and your simultaneous equation method. I will tell you what they do. Trial and error method, what they do? They do the repeated distribution only on what they do. They carry out the repeated distribution on your service departments. What is the service department? S1, S2. Now you guys tell me, what is the share? S1 has a share of 18,000. S2 has a share of how much? 8,000. Correct? Now look at this. S1 provides services to S2. How much? 10%. S2 provides services how much? 20%. Guys, correct? So look at this. We know here. So between S1 and S2, S1 provides 10% of its services to S2. S2 provides 20% of its services to S1. Right? Now what we did? First, now S1, right? What is the share of service that S1 provides to S2? So 10% on 18,000. So S2 will get how much? 1800 rupees, or in other words, overall, literally, I will reduce 18,000 here in S1, right? And I will give S2 a share of how much? 1800. Balance I will give to P1, P2, P1, P2. Yeah, that I am not bothered here. In trial and error, I am only capturing S1 and S2 first. Clear with this, guys? So I actually apportion 18,000, and how much S2 will get a share? 1800. Now S2 would have got how much? 8,000 plus 1800, 9,800. Out of this 9,800, 20% once again goes to S1. So 9,800 into 0.2, how much is it? 1960. So now S1 gets how much? 1960. Now once again, out of this 1960, what happens? S1 will give 10% to S2. Guys, so 10% of 1960 is 196. Are you all clear with this? So now once again, what happens? This 1960 gets reduced, right? And out of this 10% goes to S2. Here also S1 we had 9,800. We reduce it. Clear with this, guys? So out of this 20% we gave to S1. Now S1 got 1960. Out of this, the entire amount we reduce, apportionate to P1, P2 and S2, right? But S2 share alone we are capturing. P1, P2 we separately do it, right? How much is the share? 196. Now once again, 196, who has received? S2 has received. Now out of this 196, so 20% they will give it to whom? They will give it to S1. So S1 gets how much? 39.2 rupees roughly here. I mean, it's not roughly, it's not approximate, it is the correct figure, right? So 196 gets removed and S1 gets a share of 39.2. Now once again, what happens? 10% of this 39.2, I remove 10% of that. What happens? I receive back. S2 receives back from whom? S2 receives this back from your S1. Guys, clear with this? And once again, on this 3.92, what happens? 20% I provide. So roughly it's 0.784. So roughly it's around 0.8. Clear with this, guys? And here you round off and give back the remaining to your production departments. Or in other words, overall, if you notice, what is the sum total that you need to redistribute S1? 18,000 plus 1960 plus 39.2 plus 0.8. If you add, overall you will get how much? 20,000 rupees. Clear with this, guys? How about S2? 8,000 plus 1800 plus 196 plus 3.92 plus 0.08. Literally you get how much? 10,000. So here, using repeated distribution, they first calculate how much is the amount of S1 and S2, right? So calculating the amount of S1 and S2, it is like X and Y value. This is a concept actually similar to your simultaneous equation method, but the manner of calculating S1, S2 is through repeated distribution method. Are you guys clear with this? Right? Here, first they calculate what? Under repeated distribution method, they calculate the S1 and S2 value. Guys, clear with this? And having found this, they apportion it and they'll say, okay, sir, finally I now found out S1, though it has 18,000, right? It will give and take. Finally, S1 has a share of 20,000 rupees, sir, right? And S2 has a share of how much? 10,000. This is what we calculate there. X is 20,000. Y is 10,000. This is nothing but S1 and S2 value. Here we used mathematical equation, algebra to calculate. Here they are using repeated distribution to calculate the X and Y value. And once they calculate, now they apportion it. Clear with this, guys? What do they do? Simple. P1 and P2 has how much? 7,000 and 6,000. Guys, clear with this, guys? Right? Now, what happens here? Now, how much is S1 value? 20,000. Now, out of this 20,000, right, literally 10% will be given to S2. Only the 90% component will go to the production departments. Guys, correct with this? So, the 90% of the 20,000 is apportioned in the ratio of 4:5. Where did you get this 4:5? This 4:5 is the services rendered ratio here. Are you guys clear with this? This is one roundabout method. Guys, instead of this a time waste method, look, you did all these things, right? In your trial and error method, while doing this under repeated distribution, You could have added two more columns, P1, P2. Whenever you are distributing, calculate parallelly P1, P2 value also. By the end here itself, you would have got a P1 value, P2 value. But they are saying they will do the repeated distribution only on S1, S2, arrive at the S1, S2 value, then they will do the apportionment. It is one waste method. Literally, it's one waste method, right? But anyways, in exam, my preference, I would tell you, please follow simultaneous equation method if the question is silent, because two-way traffic, any of the three methods under your reciprocal services can be used. In my opinion, I would suggest you to use your simultaneous equation if the question is silent. So literally, how much is this? 90% of 20,000. So 20,000 into 0.9 is 18,000, right? In the ratio of 4:5. So how much does that come out to? So 4 plus 5 is 9. So divided by 9 is equal to 2,000 into 4 is equal to 8,000. 5 is equal to 10,000. You get this. Similarly, S2. Sir, 10,000 rupees is the value of S2. Out of this, so 20% I will give to S1, which means the remaining 80% is only available for my P1 plus P2. So, which means 80% of 10,000 is 8,000. This 8,000 should be apportioned in what ratio? In the ratio of 5:3. Look at this, the ratio of 5:3. Clear with this, guys? So 8,000 in the ratio of 5:3 is how much? 5,000, 3,000. So 5,000, 3,000. You add up. So P1 share is 7,000 plus 8,000 plus 5,000. It's 20,000. P2 share is 6,000 plus 10,000 plus 3,000. It's going to be 19,000. So literally P1 and P2 gets a share of 20 and 19. That is exactly what we calculated under the previous method, 20 and 19, which is going to be what? Your simultaneous equation. And once again, the same is the answer under your repeated distribution method also. Guys, clear with this? So under the three different models of your secondary distribution method, right, you only get the same answer. Are you guys clear with this? So with this single question, we have covered all the different methods of secondary distribution, and that's about the area of your secondary distribution. So please go and update your library of adjustments. Write down, please write down secondary distribution hyphen all methods. Secondary distribution hyphen all methods. Now let's move on to the next and the last part of our overhead accounting process, which is called as absorption. Now here, what do we do? Now on one side we have all the production department overheads, P1, P2, P3, right? And on the other side we have all the products. In our example, it was menswear, ladies wear, kids wear, and footwear, right? I'm just going back to the example which I had given you. So at the end of secondary distribution, I have all the production department overheads. Using a procedure called absorption, I need to convert these bulk figures into overhead cost per unit of menswear, overhead cost per unit of ladies wear, overhead cost per unit of kids wear, and overhead cost per unit of footwear. Clear with this, guys? How am I going to do this is what we are going to see in this particular third phase called as absorption. Now guys, now let me just take a different example, right? A numerical example with figures. Now let us say at the end of secondary distribution, this was the figure which I had, that is secondary distribution summary. So line item of expenses got distributed to all departments, primary distribution. Then the service department overheads got reapportioned back to my production department, secondary distribution. Now at the end of secondary distribution, I got, sir, P1 department overhead was, let us say 20,000, and P2 department overheads was, let us say 15,000 rupees. Now in my P1 department, what is the total share of P1 department's overheads? 20,000. P2 department overheads, what is the total share of your overheads? It was 15,000 rupees. Now, let us say I noticed that the total labor hours spent in department P1 was 5,000 labor hours. And let us say in department P2, I spent a total of 3,000 labor hours, right? Now, can I say, right, sir, for every hour spent in department P1, what is my overhead cost? 20,000 divided by 5,000. How much is it? It is going to be rupees 4 per hour. And here it was 15,000 department P2 divided by 3,000. It was rupees 5 per hour. Clear with this, guys? Sir, how can we do like this, sir? Simple. Now, guys, in department P1, I noticed that overall 20,000 rupees is the cost incurred in overhead cost incurred in department P2. I also noticed, sir, department P1, I'm sorry, I'm talking about department P1, 20,000 rupees the cost incurred in department P1 and 5,000 hours were actually spent in department P1, right? Now, somewhere I have to use some reasonable basis to actually apportion these P1, P2 cost to my and arrive at my overhead cost per unit. So now first I identify labor hour as the base, because as we saw here, now look at this, we have P1, P2, P3, or in other words, we have production department overheads. These are bulk figures which needs to be converted into overhead cost per unit of the products I deal in. Now, for me to bridge this gap, I need to use some basis to actually convert these bulk figures into per unit figures, right? Now, let us say this particular company feels that labor hours, let us say they are labor centric, they are more driven by labor hours. So manual labor is more that drives the overhead cost for this company. They find labor hours as the basis for incurring your overheads. So they are saying, sir, in department P1, I incurred 20,000 rupees and totally in department P1, 5,000 hours were spent, which means for every hour spent, I should apportion or I should give a share of 4 rupees as overheads, which means for every hour spent, 4 rupees is the overhead cost which is charged. Guys, clear with this? Now, sir, exactly, sir. Every hour 4 rupees is only incurred. It's not like that, but I'm using some basis to arrive and express overhead per something. Clear with this, guys? When you are expressing overhead per something, it is called as absorption rate. Are you all able to understand? So absorption rate means what? Expressing your overhead per something, it is called as absorption rate. Now in this question we used labor hours as the base, or as the base quantity as we call it. Now please understand, overall, sir, can I only use labor hours? No, there are 6 different base quantities that can be used as your basis for absorption rate, right? What are they? We will be seeing it in a few minutes from now, but as of now you just understand labor hours was one example I took. It could be machine hours, or you can even take material cost, labor cost, prime cost, or you can take units. There are 6 methods. What are they? We will be seeing it in a few minutes from now. But first of all, this company identified labor hours as the basis, or as the base quantity for apportionment of overheads. And P1 department, they are saying, sir, for every hour a product spends in P1, I will give it a share of 4 rupees. For every hour a product spends in P2 department, I will give it a share of 5 rupees. Clear with this, guys? Now, what we do here is, now let us say I manufacture 2 products, A and B. Now every unit of A passes through both P1 and P2. Let us say every unit of A spends 3 hours in department P1 and 2 hours in department P2. Clear with this, guys? Now what will I do? Sir, product A, it spends 3 hours in department P1. Every hour spent in P1 will be given a share of how much? 4 rupees. Guys, correct? So I will give it a share of 4 rupees, and every hour spent in P2 will be given a share of how much? 5 rupees. So which means product A, what is the overhead here? P1 overhead is 3 into 4, which is 12 rupees. P2 overhead is 2 into 5, which is 10 rupees. Or in other words, overall, the overhead cost per unit of product A is going to be 12 plus 10, which is going to be 22 rupees. Now, how about product B? Sir, every unit of product B, this also passes through both the departments P1 and P2. But let us say it spends 2 hours in P1, 3 hours in P2. Simple. Every hour spent in P1 will be given a share of 4 rupees. Every hour spent in P2 will be given a share of how much? 5 rupees. So it's going to be 8 here, 2 into 4, and here it's going to be 3 into 5, which is going to be 15 rupees. Overall, your product B will be given a share of how much? 23 rupees is the overhead cost per unit. Are you guys clear with this? So now what we did, we took labor hours as the basis. Step number 1, we calculated the absorption rate. Guys, are you clear with this? Now we calculated the absorption rate and found out, right? So overall, production department P1 overheads is 4 rupees per hour, P2 department is 5 rupees per hour. Step 1, we calculated absorption rate. Step 2 was charging of overheads to products. Now, product wise, I knew how many hours they spent, every unit of product, how many hours they spent in the respective department. I charged it with the respective absorption rate, and this way I calculated the overhead cost per unit of A. With this, the objective of this chapter has been achieved. Guys, are you all clear with this? So now what we did, the bulk figures now got converted into overhead cost per unit. Clear with this, guys? And with this, the objective of this chapter is to calculate overhead cost per unit. So I calculated the overhead cost per unit of A, overhead cost per unit of B. Like if suppose they have 4 products, menswear, ladieswear, kidswear, footwear. For each of the 4 products, we would have calculated. Are you guys clear with this? And that's about this particular process of absorption, which is the third phase here. So please understand here, in this case, what we do, absorption is a 2-step procedure. Step number 1, calculating the absorption rate. Step number 2, charging of overheads to the products. How do you charge it? Sir, product A spent 3 hours in P1, 2 hours in P2, so 3 into 4 plus 2 into 5, overall I get the share of overhead cost per unit of the respective products. Are you guys clear with this? As simple as that. Beyond that, there is nothing great here. Now, sir, why did we use labor hours here as the basis? If you notice, this figure was readily available both in bulk total as well as it was also readily available on a per unit level. Now, in absorption, what was our objective? We had to convert these bulk figures into overhead cost per unit. Now, we used it using a particular bridge, right, which was readily available both in bulk as well as on a per unit level. In this case, labor hours was readily available both in total as well as on a per unit level. We use that as a base to charge the overheads to product. So in this case, labor hours was used as a base to charge your overheads to products. Are you guys clear with this? So now, the labor hours only, sir, is labor hours the only base that can be used? No, there are overall 6 different base quantities that can be used for absorption of overheads. What are they? I'll be telling you in a few minutes from now. But understand, this is the third step of overhead procedure, which is going to be your absorption, wherein first, step 1, you calculate the absorption rate, and step 2, you charge the overheads to the products. This is what I have clearly explained in our concept decoder. Absorption of overheads. Absorption is the last step in overhead accounting and is the process through which overheads in the production department is given to the products produced. I've neatly condensed and put it here. Now look at this. The absorption process has 2 steps. Step number 1, calculation of absorption rate. What is this? Overheads divided by base quantity. And step number 2, charging of overheads to products. What is that? Absorption rate into the base quantity consumed by the respective product. Simple. Absorption rate into the base quantity consumed. So product A spends 3 hours in department P1 and every hour should be charged with an overhead cost of 4 rupees. So 3 into 4, 12. Here it's going to be absorption rate is 5 rupees and every unit spends 2 hours in department P2. So 2 into 5 is going to be 10 rupees. Guys, are you all clear with this? So here step number 1, calculation of absorption rate. Step number 2, charging of overheads to products, which is nothing but absorption rate into your base quantity consumed for this particular product. Instead of labor hours, it could also be machine hours. In that case, overall, sir, what do I have? So your departmental overheads divided by your base quantity, machine hours, you will arrive at the absorption rate per machine hour. Guys, clear with this? And then you will absorb it accordingly to the product. So product wise, how many machine hours I spend in the respective departments, based on that you apportion it. Are you guys clear with this? And that's about the concept of absorption. Are you all able to understand? Yes. Now clearly, guys, product A, let us take. Now product A's full manufacturing cost is what? Material, labor, direct expenses and the production overheads. Now the first 3 are prime cost components readily available on a per unit level. They are waiting with the figures. Now to this, if I add this 22 rupees, I will be able to get my full manufacturing cost, and once I get my manufacturing cost, now with this I can properly value every unit of my stock and apportion my total manufacturing cost into cost of goods sold and closing stock. With this I can achieve the overall objective of stock valuation and profit computation. Similar thing goes for product B also. So product wise you will be able to arrive at your stock valuation and all, and overall you will be able to compute what is the profit for the company. Are you guys able to understand? This is the third step of your overhead accounting, which is called as absorption. Are you all able to understand? Yes. Now one very important thing that I want to tell you here, this overhead absorbed, right, this figure that we saw, this is the figure. Absorbed overheads is actually the figure that ideally appears in your cost sheet. So this is what I have kept in this particular segment called as doubt busters. It should be noted that production overhead absorbed and not the production overheads incurred is considered while preparing the cost sheet. Clear with this, guys? So the overhead absorbed is only considered in your cost sheet. More details about that we will be seeing in the next segment of discussion, wherein I will be talking about your predetermined rate, actual rate and all. What is that? We'll be seeing quickly. We will recapitulating that. Clear with this, guys? With that we have completed the third step of the overhead accounting process, which is called as absorption. So 3 steps in your overhead accounting process. What are they? Step number 1, this is going to be your step number 1, which is your primary distribution. Line items of all your indirect manufacturing costs are apportioned between all the departments. Then step number 2, secondary distribution, where the service department overheads are redistributed back to the production departments. And step number 3, your production department overheads are apportioned to all the products. We calculate the overhead cost per unit by using a base quantity, which can be any of the 6 base quantities which we are going to see. Clear with this, guys? It's a 2-step procedure. The last step is called as absorption. We have a 2-step procedure. What are they? Step number 1, calculate the absorption rate. Absorption rate, how will you calculate? Your overheads, departmental overheads, divided by the base quantity, right? Where you get the absorption rate. And step number 2, your absorption rate into base quantity consumed. So this way you charge it to the products and you arrive at the overhead cost per unit of the product. Now for each of the products, the prime cost components are readily available. To this you add your overhead cost per unit, you will arrive at the full manufacturing cost, and with that you are achieving the objective, the first objective, which is going to be what? It is going to be the first objective of this entire subject, which is stock valuation and profit computation. As simple as that. Clear with this, guys? Right? Now technically speaking, procedural aspect, this is about it. But now when it comes to absorption, there are some advanced level, there are some advanced concepts with respect to absorption. What are they is what we are going to see here. This is where the concept of absorption costing comes into picture, which is very important and critical from an examination perspective, as well as this forms as one of the backbone for this entire subject. Right? Now before that, first I told you this base quantity in our question, we took it as labor hours in this example. Now can we only take labor hours? I told you instead there are 6 different base quantities which can be used for the purpose of absorption. What are they? We will clearly go and see this in our concept decoder book. Now look at this. 6 different base quantities that can be used: labor hours, machine hours, material cost, labor cost, prime cost, production units. Now what I will do is I will put a bracket here: labor hour, machine hour. These 2 are hours. Material cost, labor cost, prime cost, these 3 are figures, rupees, and production units, it is in units. Now guys, what is it? Labor hour rate. How will you calculate the absorption rate? Very simple. So just now we saw overheads, right, divided by labor hours. You will arrive at what? The absorption rate. 5 rupees per labor hour is what you will get. Guys, clear with this? Right? Next, sir, instead of labor hours I want to use machine hours. Yes. Who will use? Maybe if a particular company is heavily mechanized, they have advanced level of production where they use robotics and all. Sir, manual labor is less. Significant portion of my overheads is actually driven by my by your machine hours, sir. right? In that case, I use machine hour as the appropriate base quantity for charging overheads to products. In that case, how will I calculate my absorption rate? Overheads divided by machine hours. I arrive at the absorption rate per machine hour, 5 rupees per machine hour, or so on, right? Let us say every product spends, let us say product A spends 3 hours in my department. So 3 into 5, 15 rupees will be the overheads I will charge. Are you all clear with this? So in this case, how will you charge your overheads here? Simple. So first you will arrive at the absorption rate per machine hour, right? And this needs to be charged to the overheads. So to the particular charge the products by using the appropriate base quantity, which is the machine hour. So if a particular product spends 10 hours in my department, 10 machine hours, so what I will do for each of the 10 hours, I will charge it with my absorption rate. Are you guys clear with this? Exactly the same. What we saw here, exactly the same. Instead of labor hours, you can use machine hours, right? Basically, guys, only one thing. Whatever you use as the base quantity should be available both in total as well as on a per unit level. If it is available, it can bridge the gap of converting these bulk figures into per unit figures. As simple as that. That is the logic. Next one, guys. Next one. Now, material cost, labor cost, prime cost. What is this? You can also calculate the absorption rate as a percentage of material cost. In this case, what will you do? Simple. How will you calculate this overheads? It's going to be overheads divided by material cost. Now, how do we do it, sir? For example, let us say it is just an example which I am giving you, right? Let us say in P1 department, right? Now, I'm just giving you guys an example of one department, P1 department. Let us say the secondary distribution summary, or in other words, the overheads, right? I'll put it as overheads here. Overheads of this department was 20,000 rupees, right? And let us say, sir, in this department overall, sir, the cost is significantly driven by material cost. Example, I'm telling you. So the overall material cost spent in this particular department is, let us say, 10,000 rupees. Clear with this, guys? Now, I want to use material cost as the basis for apportionment of this particular overheads. Now, what will I do? I will calculate the absorption rate. Absorption rate is overheads divided by material cost. Now, the numerator is in 100. The denominator is also in, the numerator is in rupees. The denominator is also in rupees. Guys, correct? So when you use the same expression, the numerator and denominator, then you will express it as a percentage. So I will say, sir, overheads is 20,000 when my material cost is 10,000. So which means the absorption rate is 20,000 divided by 10,000 into 100. So I will say, sir, overheads is going to be 200% of my material cost. Are you guys clear with this? This is how I express my absorption rate. How much is it going to be? 200% of my material cost. Now, let us say I have a product A. Now, product A, the direct material cost per unit of product A is, let us say, 6 rupees, which means the production overheads, right, of department P1 share is going to be 200% of material cost, which means for this product A, what is the material cost? 6 rupees, sir. So its share of overheads is going to be 200% of 6, which is going to be 12 rupees. Are you clear with this? Or in other words, literally here, the bridging factor, the base quantity that I used was material cost. This figure is readily available in total as well as available on a per unit level. So using this, I expressed the absorption rate, and I found out absorption rate is generally, sir, P1 department overhead is 200% of the material cost, which means what will I do? Right, I arrive at the absorption rate. So product wise, how much ever is the material cost, apply 200% of that. That is going to be the product wise share of overheads. As simple as that. Are you all clear with this? And this is how we need to calculate. Clear with this, guys? Since both the numerator and the denominator are in rupees, we express this as a percentage. Look at this. So material cost rate, how will we calculate? My overheads divided by material cost into 100. So the expression is percentage of direct material cost. No, sir. Suppose my company is labor driven, right? In that case, I want to use labor cost as the basis. Perfect. What will be the formula? Overheads divided by labor cost into 100. So you will say absorption rate is 200% or 100% or 150%, whatever it is, of your direct labor cost. On a per unit level, you have the direct labor cost also. On that, you apply this percentage, you will charge the overheads to products. Are you guys clear with this? Or, sir, I want I want to use both material plus labor as the base quantity. Why? Because my overheads is driven by both material and labor. If you add that, you get prime cost. You can also use prime cost as a base quantity. In that case, how will it look like? Overheads divided by prime cost into 100, and you will arrive at the absorption rate, which is expressed as a percentage of your prime cost. Clear with this, guys? So literally these three are expressed as a percentage of rupees. Are you clear with, are you guys clear with this? Are expressed as a percentage of material, labor or prime cost. Reason being that you use the same unit of measure, which is being rupees, in both the numerator and denominator. As simple as that. And finally, you can also use production units method, which means what? Sir, I don't want all these things. Units itself is the base quantity. Perfect. You can use simple instead of this. Let us say in department P1 the total overheads is 20,000 rupees. 20,000 rupees. Let us say the total units that I manufacture in department P1 is going to be, for example, I am telling you, for example, let us say it's going to be 2,000 units. Which means per unit, how much is going to be my absorption rate? So 20,000 divided by 2,000. So 10 rupees per unit is going to be my absorption rate. So every unit that passes through my department, I will charge it with an overhead cost of 10 rupees. So here directly the absorption rate is expressed as per unit. Are you clear with this? As simple as that. So there are 6 different base quantities that can be used for your absorption purpose. What are they? The first 2 are in hours, machine hour and your labor hour, machine hour rate. Then 3 rupees, what are they? Material cost, percentage of material cost or labor cost or prime cost. And finally you have production units method. Are you guys clear with this? With this you can actually perform your absorption. You can perform the third step, which is your absorption. So there are 2 steps inside this absorption. What are they? Step number 1, calculating of absorption rate. Step number 2, charging the overheads to products. And as simple as that. Clear with this, guys? Now on this note, let us go and do one numerical problem, right? So in your CA Inter solved question bank, so please take question number 7. Please take question number 7. See, for marathon purpose, I'm selectively picking and doing only a few sums which are kind of comprehensive, or maybe which represents the concepts, right? I think it's 1 second. Sorry, question number 6. Question number 6. Right. So please take question number 6. So in our regular and exam oriented batches, we do all the questions. So here we are doing some selective questions just for the sake of revision. I take some good questions which cover the concepts predominantly, right? Now look at this. AC Limited is a small company that undertakes a variety of jobs for its customers, right? And the budgeted P&L statement for the year ended 31st of December is as follows. Sales figure is given. Cost, material, wages, subtotal, prime cost, fixed production overheads, you add it, you get your production cost. Then if you add your selling, distribution and admin, you get your total cost. Sales minus total cost gives you your profit. Now budgeted data is available. Labor hours for the year, machine hours for the year, number of jobs. Basically, it could be a unit or a job costing. Basically, it's number of units or jobs, 300 units or 300 jobs. An inquiry has been received and the production department has produced the estimates of the prime cost involved and of the hours required to complete one particular job, A57. Right? So now what are they asking? Now guys, now this is the total data, right? And for one job, they are giving this data. For this particular job, how much the material, direct wages, subtotal, prime cost, and for this job, how much the labor hour required, machine hour required, and all is given. Step number 1, you are required to A, calculate by the different methods 6 overhead absorption rates. What are the 6 methods or 6 base quantities we have? So labor hour, machine hour, then percentage of material cost, labor cost, prime cost, and production units method, right? And number 2, B, calculate the cost estimate for this job A57 using in turn each of the 6 overhead absorption rates which we computed in A. So first one, guys, what we need to do here is that we need to compute this absorption rate. Now first method is what? Labor hour rate. What is that? Overheads divided by labor hour. Now what they have, so the total data is available, sir. What is the total overheads here? Total overheads is 3 lakh rupees. Now I want to calculate, sir, how much is the overhead attributable to the single job? Now I want to convert a bulk figure into a per unit figure or a per job figure. How will I do that? Using this absorption only, right? Now how do I do that? How do I do that? Now using any of the 6 different absorption rates. Now in this particular question, so the first thing we need to do is what? In all the cases, the overheads amount is going to be 3 lakhs. Now what is the first method? So it is going to be labor hour rate. So how will you calculate the absorption rate? So 3 lakh divided by 25,000 hours, I get the absorption rate expressed per labor hour. So how much is this? 3 lakh divided by 25,000. So 3 lakh divided by 25,000, how much you get divided by 25,000? You get 12 rupees per direct labor hour. So if I use labor hour as the base quantity, the absorption rate is 12 rupees per labor hour. Okay, if you are using machine hour as the base quantity, so divide 3 lakh with 15,000 machine hours. So 3 lakh divided by 15,000 machine hours, I get how much? 20 rupees per machine hour. Clear with this, guys? Now a company can follow any one of these 6 methods at a time. Clear with this, guys? I can't use everything, right? But this is like your different methods of depreciation. It's an accounting policy. Here it's a cost accounting policy, right? So you can't use SLM and WDV. You can either use SLM or WDV. Clear with this, guys? Similarly here, you can either use labor hours, or you can use machine hours, or you can use material cost as a basis, or whatever it is, any of the 6 base quantities. Next, sir, if I want to use my direct materials as the base quantity, then it's going to be 3 lakh divided by 1 lakh into 100. Clear with this, guys? So production overheads divided by direct material cost into 100, 3 lakh by 1 lakh into 100, which is going to be, overheads is going to be 300% of my direct labor cost. This is how we compute it. Yes, 300% of direct labor cost. The next one, labor cost. How much is that going to be? Now, if I'm going to use labor cost as the basis, so 3 lakh divided by 50,000 into 100. How much is that? 3 lakh by 50,000 into 100 is 600% of labor cost. Clear with this, guys? Or if you want to use prime cost as the base quantity, 3 lakh divided by 1 lakh 50 into 100, I will say overhead, sir, is 200% of my prime cost. Look at this, 200% of prime cost. Or directly, if you want to use production units method, your overall production overheads divided by the total number of units. Here it's not units, it's jobs. So 3 lakh divided by 300, sir, per job, how much is it going to be? 1 lakh rupees per job. Are you guys clear with this? 1 lakh rupees per job is going to be your absorption rate. So using the 6 different base quantities, now we have computed what? The 6 different absorption rate. Any one only the company can follow. Now what have they asked? Sir, for this particular job, A57, I have given how much is the material, how much the wages. Prime cost components are readily available. To this, if you add the particular job's share of overheads, you will arrive at the total cost of this job. Guys, clear with this? Now they are asking us to calculate what the total cost estimate for this job using each of the 6 different rates calculated above. Right? Now how do we do it? So simple. First one, guys. So charging of overheads to this job, right, and calculating the total cost of this particular job A57. Now, whether I use labor hour rate or machine hour rate or material cost, labor cost, prime cost, or production units method, it is not going to change my prime cost component. So how much is my direct material? 250. How much my direct wages? 200. So total prime cost is 250 plus 200, 450 rupees. So now this 450 rupees will not be changing. Why? Because all these 6 different base quantities are used only on my indirect manufacturing cost, namely my overheads. So my overheads calculation will never impact my prime cost components. Clear with this, guys? Now only my production overheads figure will change. Now first, if I use labor hour as the base quantity, right? Now in that case, what is the absorption rate? Sir, for every labor hour, you should charge the product with, you should charge it with 12 rupees. Now this particular job use how many labor hours? 80 labor hours. So the overheads for this particular job is going to be 80 labor hours into 12 rupees. So 80 into 12, it's going to be how much? 960 rupees is the cost, overheads cost for this particular job. So 960 plus 450, how much you get? 1410. Are you guys clear with this? So here I get what? 960 rupees. Clear with this, guys? Next one. Machine hour rate if I use. Now in this case, what is the absorption rate? 20 rupees per machine hour, and this job use how many machine hours? 50 machine hours. So here it's going to be, so absorption rate 20 into the actual base quantity consumed, which is 50 hours. So it's going to be 15 to 20 is 1000. So 1000 plus 450. Overall, if I use machine hours as the base quantity, the total cost of this job is going to be how much? 1450. Clear with this, guys? Next, sir, no sir, I'm using material cost as the basis, percentage of material cost. How much is my absorption rate? 300% of the material cost. Sir, for this job, how much is going to be the material cost, sir? 250 rupees. Guys, correct? So 250 into 300% is 3 times of 250. So now the overheads for this particular job in this case is going to be how much? 750 rupees. So what will be the total cost? Prime cost 450 plus 750 of production overheads. It comes out to 1200 rupees. Are you guys clear with this? Next one. Sir, I'm going to use labor hour as the base quantity. I mean labor cost, percentage of labor cost as a base quantity. How much is it? 600% of my direct labor cost. How much my direct labor cost? 200 rupees. So 200 into 600%, that is 6 times of 200 is going to give me how much? 1200 rupees. Are you guys clear with this? So in this case, it's going to be how much? 1200 rupees. So 450 plus 1200. 450 plus 1200, you get how much? You get 1650 as the total cost of this particular job. Suppose I am using 200% of prime cost as a base quantity. So the absorption rate is 200% of prime cost. Simple. What is the prime cost for this product? 450. So 450 into 200%, that is absorption rate into base quantity, right? So 450 into 200%, it's 900, and 450 prime cost plus my production overheads of 900 gives me how much? 1350. Are you all clear with this, guys? And finally, you get your production units method. So now in this case, directly, how much is that going to be? Sir, per job, 1000 rupees the cost. Directly, this is for one job only we are calculating. So 1000 into 1 is going to be 1000. So 450 plus 1000, you get how much? 1450. Are you guys clear with this? Right? So now, depending on what method you use as the base quantity, it affects the total cost of this particular job. Guys, are you clear with this? So you have to be very, very careful while picking the method. You need to provide the justification. Randomly, you can't use methods. I'm talking about real life. So the companies need to disclose this in their cost audit report as to why they are using a particular method of absorption and doing it. For example, if I'm using machine hours, I need to justify, sir, I am a company which uses a lot of machines and I have a lot of mechanization, automation that happens. Manual intervention is less. Hence, for me, it makes sense to use machine hours. Like this, they need to give a justification because the selection of method will affect the cost of the product. Are you guys clear with this? Hence, look at this. If I use labor hour as the basis, it's 1410. If I use labor cost as the basis, it's 1650. If I use prime cost as the basis, it's going to be 1350. So randomly, all these costs are changing. But remember, the costs will change not because of the prime cost. It remains same. But purely because of what? It changes purely because of production overheads, which is actually calculated depending on the method of your choice. Are you guys clear with this? Hence, it needs to be clearly disclosed on the face of your cost sheet. I mean, on the face of your cost audit report. Are you guys clear with this? Yes. And with this, literally, we have also completed the 6 different types or the 6 different types of base quantities. So please just go and update your library of adjustments. Write down 6 types of absorption rates. 6 types of absorption rate. So in our regular and in our exam oriented batches, I'll actually be doing an even more in-depth explanation and also solving more number of sums. Every single sum we'll be solving here. But here in a marathon, since we are revising, this is meant for revision, right? I am condensing it and presenting it. There also, I'm trying to provide you every single concept, right? And I'm not providing any kind of dilution here. I'm not making any dilution. I'm trying to condense it and present it. So predominantly the assumption here is that you would have already studied it once. Still, wherever possible, I'm starting from the scratch and I'm building the subject. So with this marathon itself, right? So a lot of complicated concepts we are covering because overheads is not a straightaway easy area, right? It has a lot of other complexities, especially the ones we are going to see, after the sum, right? Whatever we are going to see, predetermined rate versus actual rate, under or over absorption. That's a very critical discussion of overheads, which we'll be seeing, right? So please go and update your library of adjustments. Write down 6 types of absorption rate. 6 types of absorption rates. Right? So with this, we will now move on to the next segment of discussion in this particular chapter. Now, the next concept is predetermined rate versus actual rate. Now, one of the most important aspect of this chapter, From here, the chapter gets very technical. In fact, in our regular and exam-oriented batches, right? This is a very detailed discussion. However, I will condense it for the purpose of revision without diluting on the core concept. Now, guys, now what is the next concept that we are going to talk about? Predetermined rate versus actual absorption rate. Simple. What do you mean by predetermined rate? What do you mean by actual absorption rate? Absorption rate, how do you calculate? Overheads divided by the base quantity. Let us take for our example purpose labor hour. But remember, it can be any of the 6 base quantities. Now, predetermined rate, or it's also known as budgeted rate, means if I use budgeted figure in the numerator and budgeted figure in the denominator, it is called as budgeted absorption rate or predetermined absorption rate. Are you clear with this? Predetermined means what? Already fixed, budgeted. That is, predetermined rate is equal to budgeted overheads divided by budgeted base quantity. Clear with this, guys? That is what I've mentioned here in our concept decoder. Budgeted overheads divided by budgeted base quantity. Whereas actual absorption rate means what? Actual overheads divided by actual base quantity. Simple, guys. Now, your absorption rate is what? Your overheads divided by the base quantity. If you calculate the absorption rate using the budgeted data, it is called as predetermined rate. Clear with this, guys? And if I calculate the absorption rate using the actual data, it is called as actual absorption rate. Sir, what is the big deal here, sir? Now, let me give you guys an example, and with the help of this example, we will understand the issue here in this particular concept. So, predetermined rate versus actual rate. Let me take you an example. Let me give you guys an example. Let us say the budgeted overheads is equal to rupees 3 lakhs. Okay, and the budgeted labor hours, let us take labor hours as the base quantity. The concept is equally applicable for all the 6 different types of base quantity. Let us say I budgeted to have 20,000 labor hours in this period, right? So this data is available before the start of the year itself. Now, which means the predetermined absorption rate, which means the absorption rate calculated using my budget data is equal to 3 lakh divided by 20,000. How much is that going to be? Rupees 15 per hour. Clear with this, guys? So the absorption rate calculated on the basis of my budgeted data is going to be equal to 15 rupees per hour. Let us say once the period is over, I got to know, sir, actual overheads was how much? Actual overheads was rupees 3,20,000. Let us say actual overheads was rupees 3,20,000, and in this period actual labor hours spent were 16,000 hours. Clear with this, guys? Which means the actual absorption rate, overheads per labor hour, actual overheads per labor hour is equal to how much? 3,20,000 divided by 16,000. How much is that going to be? So it is going to be, so 3,20,000 divided by 16,000, it gives you how much? Rupees 20 per hour. Clear with this, guys? So with this we can say, look, sir, the budgeted rate or the predetermined rate, or it is also called a standard rate. These are interchangeably usable terminologies, or in other words, the absorption rate calculated using the budgeted data is going to be 15 rupees per hour. Whereas, sir, actually I plan to incur 15 rupees per hour. That is the overheads. Whereas actually seeing, I ended up incurring how much overheads? 20 rupees per hour. Are you guys clear with this? Right? So this is called as predetermined rate. This is called as actual rate. Fine, perfect. Now, let us say I am a pen manufacturer, right? Now, I have to produce every unit of a pen. Let us say to produce 1 unit of a pen, let us say it takes 2 hours, right? So to produce 1 unit of pen, it takes 2 hours. Now, for this, every hour, I need to charge the product with an absorption rate, correct? Yes. Now, you guys tell me, will I charge will I charge or will I use my predetermined rate for charging the overheads to products, or will I use my actual rate for charging overheads to product? Sir, every time I produce 1 unit of pen, it takes 2 hours, sir. So for every hour actually taken by this pen, should I charge it with an overhead of 15 rupees or should I charge it with an overhead of 20 rupees? Right? Now, many of you will be thinking that, sir, we should charge it only with 20 rupees actual rate. Why? Sir, because 20 rupees was the figure which was actually incurred. Guys, clear with this. 20 rupees was the amount which was actually incurred. So for every hour taken by the pen, I should charge it with the 20 rupees of overheads. Guys, clear with this. This is what many of you might think. But the answer is no. You should always use predetermined rate only. Clear with this, guys? Sir, why, sir? Why should we use the budgeted rate or the predetermined rate for the purpose of carrying out absorption? Right? Now, there are 3 reasons. Now, let us not get too technical. One main reason I will tell you, right? And that is the core of the concept of absorption costing. Very, very important. Only if you know this, you can move on to the next concept of under or over absorption. Now, first, guys, we are in what subject? We are in what subject? We are in cost and management accounting. Right, guys? Now, in costing, what is the objective of this chapter, of this entire subject? We have 3 different objectives, right? Stock valuation, profit computation, decision making, control, and all these things. Now, always remember, our subject, costing, cannot wait till the year end, right? Costing is a concurrent process, right? Whereas financial accounting, that is a post-mortem work. Once the year gets over or once a transaction happens, I record it, because the objective of financial accounting is completely different. Whereas in our subject, costing is a concurrent process. Sir, what do you mean by concurrent process? Simple, guys. Now, the moment this particular raw material is fed into my machine and my raw material gets converted into FG, the moment my FG comes out of my machine, now I should be valuing every unit produced. I should charge it with an overheads also. Prime cost components are readily available on a per unit level the moment my pen or the product FG comes out of the machine. Whereas now my overheads is the only figure that is not readily available on a per unit level. That's why we use the concept of absorption. Now, concurrently, as and when a particular product comes out of the machine, now will I be having my actual rate? No, I will not be having my actual rate, because actual rate is what? Actual overheads divided by actual hours. Now, if I charge it with actual rate, I need to wait till the end of the year, because only then this total actual overheads is known and only then the actual hours is known. If I divide the two, only then I will get my actual rate. But costing cannot wait till the end of the year. Then and there, whenever a product is moving from stores to WAP area, from WAP to FG area, wherever it is moving, it has to move along with the cost. Hence, costing is a concurrent process, and I need to value every unit of my stock produced then and there. Hence, since costing is a concurrent process and it cannot wait till the end of the year, the only solution for me available is to mandatorily use my predetermined rate. Sir, how will I use predetermined rate? Simple. Budgeted overheads divided by budgeted hours. These two are already readily available as and when my particular output comes out of my machine. Yes, so this 15 rupees per hour is readily available, right? I need not wait till the end of the year to arrive at this figure. Hence, what I do is, so I can definitely use this amount. Predetermined rate can be used, and using the predetermined rate, I charge my overheads to the products. Are you guys clear with this? So always remember, this is a very, very important and a critical understanding of this entire overheads chapter. Sir, it is wrong, sir. I have actually incurred 20. How can I charge it with 50? Wait, at the end of the year, we do some rectification of error. Ideally, it's not called rectification of error, but for you to understand, I'm using the word rectification of error. That is only called as under or over absorption. We compare it with the actual and we do the adjustment. Do not worry. Right now, what is the figure available? 15 rupees, sir. Every time a product passes out of passes out of my machine, right, what I do is I charge every hour with the predetermined rate of 15 rupees. Are you guys clear with this? This is a very, very important discussion here. Are you guys clear with this? So literally guys, always remember, when absorption, I told you, is a two-step process. Step number one, calculation of absorption rate. When we say calculation of absorption rate, it is always the predetermined rate that we calculate. Clear with this, guys? So 15 rupees is what we calculate. In our example, we never calculate the actual rate. Now, having calculated the predetermined rate, so what is step two? Charging of overheads to products. So what is the formula there? Predetermined rate into actual base quantity consumed. Now this 15 rupees, I actually multiply it with 2 hours. Sir, this 2 hours, this is budgeted? No. When I am charging to the product, step 2, here I use the actual base quantity consumed. Sir, every unit, sir, it has come out of the machine. We know how many hours it has actually spent inside the machine. Yes, sir. So that actual data, actual base quantity consumed is readily available. Yes. So predetermined rate into actual base quantity consumed is what is your overhead absorbed. Are you guys clear with this? If you just look at it, look, this is what they say here. If you notice the previous thing here, step number 1, calculation of absorption rate, which we saw earlier. This absorption rate always refers to what? Predetermined rate, right? And having calculated the predetermined rate, we charge it to the products, right? So what is the formula here? The absorption rate, predetermined rate into the base quantity consumed, right? Which means it's the past tense, which means actual base quantity consumed. Or in other words, sir, I produced one product, sir. Every unit requires 2 hours. Actually, it has spent 2 hours. For every hour it has actually spent, I will charge it with the predetermined rate. In our example, 15 rupees. Clear with this, guys? Like this, as and when I produce a product, I charge it with a predetermined rate. Are you guys clear with this? This is a very, very important and a critical understanding that you need to have. So in absorption, right, so two-step procedure. Step number 1, calculation of absorption rate. It is always the predetermined rate that we use. We never use the actual rate, right? And step 2, while charging of overheads to the products, it is predetermined rate into the actual base quantity consumed by the respective product. So here, sir, 1 unit of FG has actually consumed 2 hours. For every hour it has actually consumed, I should charge it with how much? 15 rupees. So the overheads absorbed will be 30 rupees per unit. Clear with this, guys? Like this, let us say at the end of the year, overall, all the units put together has actually consumed totally how many hours? Sir, 16,000 hours is what all the units put together have actually consumed. So I will say, sir, the overheads absorbed, or the absorbed overheads, is equal to, how much will I say? Each and every unit, right, put together, all the units have consumed a total of 16,000 hours, and for every hour actually spent, I would have charged it with a predetermined rate of how much? 15 rupees. So 16,000 into 15, how much you get? So the total absorbed overheads is going to be 2,40,000 rupees. And please be very, very clear, this absorbed overheads, 2,40,000, is the figure that appears in your cost sheet. In your cost sheet, you have this format, right? So your direct material plus direct labor plus direct expense gives you prime cost. These prime cost components are actual figures. Why? They're readily available on a per unit level as and when a product comes out of the machine. Plus production overheads I had. So production overheads is always, the figure is absorbed overheads. Clear with this, guys? So it is not a budgeted overheads. It is not an actual overheads. Also, it is an absorbed overheads. Are you guys clear with this? So it is always the absorbed overheads that gets recorded in your cost sheet. So that's why we call absorbed overheads as nothing but overheads accounted. This is the figure that has been considered in costing. This is a very critical discussion in our entire chapter of your overheads. Clear with this, guys? Or in other words, now at the end of the year, now we have 3 figures. So what are the 3 figures we have? One is budgeted overheads, then we have absorbed overheads, and then we have actual overheads. Sir, budgeted overheads, how much is it? Simple, budgeted hours, 20,000 into budgeted rate, or the predetermined rate, correct, right? Which is nothing but 3 lakh rupees. Guys, literally we have 3 lakh rupees of budgeted overheads, right? How did you get this? This is nothing but budgeted hours into predetermined rate or budget rate. Clear with this? This is how you get it, 20,000 into 15, right? Whereas on the other side, you have actual overheads. How much was that? Rupees 3,20,000. Or you can say actual overheads 3,20,000 is nothing but sir, actual hours into actual rate 16,000 hours into 20. This way also you can say it's actual hours into actual rate, right? And in between you have absorbed overheads. We got it. How much was it? 2,40,000. So 2,40,000. So now how did you get this 2,40,000? Simple, sir. We used the budgeted rate, predetermined rate, right? Predetermined rate we applied on the actual hours consumed. So here into actual hours. Clear with this, guys? That's what we did. We took the predetermined rate and applied it on the actual hours, right? So for every hour actually spent in the factory, I charged it with how much? 15 rupees. Or in other words, a hybrid thing. I take the rate from the budgeted data and multiply it with the actual base quantity consumed. This way, this is nothing but 2,40,000 of overhead accounted for. Clear with this, guys? So now literally budgeted overheads is nothing but overheads planned. Actual overheads is nothing but overheads incurred, and absorbed overheads is nothing but overheads accounted. Are you guys clear with this? Are you guys clear with this? So now, guys, what happens? So as and when in our example I told you, sir, one unit takes 2 hours, right? Let us say at the end of the year overall I have produced 8,000 units, right? 8,000 into 2, that's why we consumed a total of 16,000 hours. Clear with this, guys? So now what happened? Every unit took 2 hours, right? And every time I consume 1 hour, I was charging the product with 15 rupees of overheads. Like that, at the end of the year, actually I produced 8,000 units, and these 8,000 units put together actually consumed 16,000 hours. And for each of the hours actually consumed, I charged it with 15 rupees, 15 rupees, 15 rupees. And like that, overall, I accounted for an overheads of how much? 2,40,000. So our subject costing would have accounted for an overheads to the extent of how much? 2,40,000 rupees. Now at the end of the year, so this kept on going, and every time a product got produced, for every hour spent we were charging it 15 rupees. Like that, we kept on accumulating, and we overall at the end of the year we noticed that we have accounted a total overheads of how much? 2,40,000. Now at the end of the year I also got my actual figures. Actual overheads incurred was how much? 3,20,000. Now I can't just leave it like that. I have till now accounted only for 2,40,000, but look at it. Actually I have incurred how much? 3,20,000 rupees of overheads, which means this difference now needs to be accounted for. Guys, clear with this, guys? Yes. So now the difference between absorbed overheads and actual overheads is what we call as under absorption or over absorption. Are you guys clear with this? So in order to calculate the under or over absorption, you need to compare absorbed overheads, which is the overheads accounted, with the actual overheads, which is the overheads incurred. I have accounted only for 2,40,000, but at the end of the period I noticed that I've actually incurred how much? 3,20,000 rupees. Are you guys clear with this? So now what do we do with this? Now in this case you should have accounted an overheads of how much? 3,20,000. You have only accounted for how much? 2,40,000. So your absorbed accounted overheads is less than the actual overheads. So I call it as under absorption, because the absorbed overheads is less than the actual. So here it is called as under absorption. So in this case, how much is the under absorption? 3,20,000 minus 2,40,000. Overall the under absorption amount comes to 80,000. I have accounted overheads less to the extent of 80,000 rupees, which I now need to bring it into the books. Are you guys clear with this? Now there could also be a case of over absorption. Yes, absolutely. Suppose based on the predetermined rate and all, I kept on charging more, right? Let us say at the end of the year I noticed that the actual overheads absorbed was 4 lakh rupees, right? Overheads absorbed is 4 lakh, actually incurred is only 3,20,000. In this case, there is an over absorption to the extent of 80,000. 4 lakh minus 3,20,000. So now I need to reduce or bring down my overheads. It's called as over absorption. Clear with this, guys? So now, how are we going to treat this under or over absorption is the subject matter of study in the next upcoming concept, which I'm going to do right now. But for you to understand this, first you need to understand the concept of predetermined rate versus actual rate, and you need to know that necessarily I need to use predetermined rate because costing cannot wait till the end of the year. Costing is a concurrent process. As and when a product gets produced, I need to charge it by using the predetermined rate. If I want to use the actual rate, I necessarily have to wait till the end of the year, which cannot be done in costing. Clear with this, guys? That defeats the objective of our subject, because that's how we are able to value the stock. The stock movement, the cost needs to move or flow along with the products. Clear with this, guys? Hence, costing is a concurrent process. It cannot wait till the year end. Clear with this, guys? And because of usage of predetermined rate, I use my absorbed overheads is different from my actual overheads. Hence, at the end of the year, I compare my absorbed with the actuals. If my absorbed is less than actual, now I need to add the cost, right? I would have accounted less by 80,000. I need to introduce this cost. If my absorbed is more than actual, it's called over absorption. Now I need to go and reduce the cost which I have already accounted for. Are you guys clear with this? That is the concept of under or over absorption. Now, guys, now how are we going to treat the under or over absorption? But before that, here I have clearly mentioned in our concept decoder as well. So under or over absorption is nothing but you need to compare the actual overheads with the absorbed overheads. Don't think positive, negative and all. Don't do it like that. If my absorbed is more than actual, it's over absorption. If my absorbed is less than actual, it's called as under absorption. Now we are going to study, right? Look at this. If my actual is more than absorbed, which means absorbed is less, it's an under absorption. If my absorbed overheads is more than actual, then it is called as over absorption. Clear with this, guys? Now, how are we going to treat the under or over absorption is the subject matter of study right now. Now, let's get started. So, treatment of under or over absorption, the most critical point here. So once we do this, literally this entire chapter's core concept is now getting over. So this is the most important part of discussion in this entire chapter. Now guys, now I told you that this 2,40,000 rupees is nothing but the overheads accounted, correct? Or in other words, if I were to prepare the cost sheet of this company, if I were to prepare the cost sheet of this company, we have direct material, direct labor, direct expense. This gives us the prime cost. Now all these prime cost components are actuals, right? Plus production overheads. Now how much is my production overheads? Now I would have only accounted for 2,40,000 because absorbed overheads is the figure that is getting accounted. 2,40,000 rupees. Clear with this, guys, right? Now at the end of the year, I noticed that, look, your actual overheads is how much? 3,20,000, but the overheads absorbed is only 2,40,000, which means you have under accounted or under absorbed to the extent of how much? 80,000 rupees, right? Now I need to now account for this 80,000 rupees, right? Now guys, the question is, should this 80,000 rupees be treated as a product cost or should I treat it as a period cost? Clear with this, guys, right? Or in other words, simply put, this cost sheet, if I were to present this in a trading and a P&L format, right? Now this 2,40,000, right, appears in your trading account because it is a product cost considered for the purpose of stock valuation. Now the question is, this 80,000 rupees of under absorption here, right, which means I need to introduce this 80,000 as a cost. My actual was 3,20,000, but as of now I've accounted only for 2,40,000. This 80,000 I need to account right now as cost. Should I take it to my trading account or should I take it to my P&L account, or in a format of cost sheet, should I add it here itself, right? before my cost of goods sold, or should I treat it at par with my AOH, SOH and all, is the subject matter of discussion here. Sir, what is the big deal, sir? If I treat it as a product cost, it will impact my stock valuation. If I treat it as a period cost, P&L item, it will not impact my stock valuation. Directly it gets transferred to my costing P&L account, so no problem at all. Clear with this, guys? Now the subject matter of discussion is what? How do I deal with my under or over absorption? Clear with this, guys? Now globally there were two arguments. One set of people said, look, production overheads is a trading account item, it is a product cost item, so any under or over absorption of this particular production overheads should be treated as a product cost only. This was globally one argument put forth, but it is not a very logical argument. Clear with this, guys? Why? I will tell you. There was another set of argument which said, look, always under or over absorption should be treated as a P&L account item, or in other words, it should be treated as a period cost. This is what another set of people globally, they argued. It should always be treated as a period cost taken to your P&L account, or in other words, in a format of cost sheet, it should be taken along with AOH, SOH, then one more line item which is under or over absorption of your production overheads. Why? This seemed to be more logical. Sir, why, sir, this was more logical? Now, you understand, I'll tell you one example. I'll give you an example. With the help of this example, let us understand. Let us say on the 1st of January of a particular year, right, on 1/1, a board meeting happened where they finalized the budget. Let us say the budgeted overheads was 3 lakh rupees, right, and the budgeted hours were, let us say, 20,000 hours, which means how much is the predetermined rate? 3 lakh divided by 20,000. For every hour spent, I will charge it with an overheads of 15 rupees per hour, right? Now what happened? The board meeting got over. First 1/1 of this year, right? The board meeting got over. Now what happened? The moment these guys stepped out of the board meeting, they noticed that the entire factory was on strike. Some labor issue was there. Entire factory was on strike. Now the strike continued so long and it got over on 31st of December, which means at the end of the year, one full year, zero production. All the workers were on strike on 31st of December at 11 p.m. in the evening. Now what happened? In the night, 11 p.m., what happened was, sir, finally this board and all this board members and the workers and all, somehow they peacefully agreed for a wage rate and all these things, some wage related problem. So the workers also got convinced and they said, okay sir, now the dispute has been resolved. From tomorrow, new year onwards, the next year, fresh year, sir, we will start our production. Now our managing director asked, look, this year, right now it's already 11 p.m. One more hour is left. Now I don't want to close this year without producing anything. Sentimentally, please send one worker, ask him to produce only one unit and give it. That's all, right? Because let us not close this year without producing anything. So what happened during this year? What has happened? The actual overheads, let us say, was 3 lakh rupees, right? Let us say this 3 lakh rupees was factory rent. Whatever they budgeted, it was incurred, because irrespective of actuals, the rent needs to be paid. Now what is going to be my actual hours spent? Only 1 hour was actually worked, guys, correct? Right? Now if I calculate the actual rate, how much is my actual rate? 3 lakh divided by 1, right? That's going to be 3 lakh rupees per hour. Anyways, forget it. We are not bothered about this. We are convinced that we need to use predetermined rate. Now what would have happened? Now during this year, in my trading account, what is my production overheads absorbed? Sir, predetermined rate for every hour actually worked, I will charge it with 15 rupees. So 15 into 1, my overheads absorbed would have been 15 rupees. Guys, correct? Now absorbed overheads was how much? 15 rupees. Actual overheads is how much? 3 lakh rupees, which means how much is my under absorption? Sir, I have actually incurred 3 lakh, but overheads accounted was only 15 rupees. How much is my under absorption? My under absorption is 2 lakh 99,985 rupees. This is my under absorption, right? Now, suppose if I treat this also, under absorption also, as a product cost, now what would have happened? I will take it to my trading account. I will consider the under absorption 2,99,985 as a part of my product cost. Now what would happen? Now this is the total cost of production. I have not sold anything, so my closing stock will be valued at 15 plus 2,99,985. I will value my closing stock at 3 lakh rupees. Now how many units of closing stock is there? 1. So now what happens? 1 unit will be valued at 3 lakh rupees. Are you guys clear with this? Now at the end of the year, the auditor, right, he is coming for a stock audit, stock count. Now the manager, this particular manager of the company, saying, sir, you don't come, sir, I will bring the stock to your location. So this particular manager goes to the auditor's office, right, and the auditor saying, what, you have come empty handed, where is the stock and all, right? What is the lorry waiting outside? Our manager will say, no sir, only 1 pen has been produced, carefully count and give it back. Now the auditor will be shocked. What? Only 1 pen has been produced. I mean, only 1 pen is there in closing stock. But why is the closing stock valued at 3 lakh rupees? Guys, are you understanding the issue here? Now, if I treat this under absorption, right, as a product cost, under or over absorption, as the case may be, my stock valuation will go for a toss. 1 unit of stock gets valued at 3 lakh rupees, or in other words, my actual overheads incurred might be having my efficiencies or inefficiencies. Guys, clear with this? There could be inefficiency that gets captured in my under absorption. Now, if I treat my under absorption as a part of product cost, inefficiencies will get into my stock valuation. Hence, always remember what they are saying. Stock is not valued at actual cost. It should only be valued at standard cost. Are you guys clear with this? Hence, for this purpose, the correct thing to do is that now what you need to do globally, this is what they follow. So they don't take the under absorption here. Look, what they do is only 15 rupees, right? Absorbed overheads is only taken to your, considered as a part of your product cost. Any under or over absorption, 2,99,985 in our example, is taken to your P&L and always treated as a period cost. In this case, my stock gets valued only at 15 rupees, that gets carried forward the next year. Sir, this difference 2,99,985, sir, it's a benefit lost. Don't consider it as a part of your stock, right, and value your stock more. This gets knocked off. I will book a loss of 2,99,985 in this year. This cost should die. It should expire in this year itself. Are you guys clear with this? Hence, globally, what they say is they treat under or over absorption as a part of period cost. They take it as a P&L account item. Are you guys clear with this? Now, sir, is this what we need to do? No. Now, always remember, in India, we Indians are extremely clever and we are extremely intelligent. In India, we follow a slightly different approach. What do we do? Now, extraordinary treatment, this is covered in your cost accounting standards, right, which is ideally a part of CMA intermediate syllabus. Cost accounting standards are prescribed by your CMA institute. Now, in India, what we follow is, now, how much is the under or over absorption, right? Forget this particular question. Now, going back to our original example, sir, under or over absorption, how much is it? 80,000 rupees, in this case, under absorption. Now, globally, what they do, they treat it as a period cost. In India, what they do is, okay, 80,000 rupees in our example is under absorption. Similar treatment for over absorption. Now, they don't jump to a conclusion and say, look, this 80,000 should be treated as a product cost, or this 80 should be treated as a period cost. They don't do that. Now, what they do, they classify this into two. Now, tell me, out of this 80,000, now, let us say, for example, 5,000 rupees, sir, right, has been actually incurred because of normal price level changes, inflation. Look, how much was the overhead absorbed? Going back to our original example, only 2,40,000. but actual was how much? 3 lakh 20. Sir, why was the actual more? What is the difference between overheads absorbed and overheads actually incurred? 80,000, which means actual is more. Guys, correct? Now, by 80,000, now out of this 80,000, they are saying, sir, to the extent of 5,000 rupees, genuinely, sir, on account of price level changes, inflation was there. When we budgeted, the inflation we didn't factor. Suddenly in this year, this inflation also happened. So 5,000 rupees increase in actuals was genuinely on account of inflation, sir. The balance 75,000 rupees of difference is because of any abnormal reasons or maybe because of inefficiencies in the management. Are you guys clear with this? So hence a strike or other example. Clear with this, guys? So out of this 80,000 rupees of difference between my absorbed and actual, or in other words, actual was more, the 5,000 rupees was genuinely because of inflation, right? And the balance 75,000 rupees was purely because of any abnormal reasons. Are you guys clear with this? Abnormal reasons. Are you all clear with this? So now in India, what they are saying, to the extent of 5,000 rupees, you treat it as a product cost. To the extent of 75,000 rupees, you treat it as a period cost. Are you guys clear with this? Right? Why? Sir, 5,000 rupees genuinely on account of price level changes. So if there is genuinely a price increase, it should go and impact my stock valuation. Whereas the 75,000 rupees is because of inefficiency, strike and all, there is an under absorption, over absorption. No, take it to your P&L account. It should fully expire in this year itself. A classic treatment is what we follow in India. Are you guys clear with this? This is the most intricate part of discussion in the entire subject, in fact, right? And once again, generally in our regular and exam oriented batch, I take a lot more examples, explain, and we do a lot more sums. But since we are doing a marathon here for revision purpose, still I didn't want to dilute. Wherever possible, I'm still taking examples and figures and explaining it. Trust me, guys, I'm trying to condense a very complicated and a very big area. So this is for the purpose of revision. Clear with this, guys, right? So what they are saying, so first, if there is an under or over absorption, split it into two. If it is because of normal reasons, it should be treated as a product cost, or to put it in understandable words, take it to your trading account. We don't have a trading account and all in our subject, but I'm telling you for your understanding, to the extent of 75,000, you take it as a product cost. It's a P&L account item. Clear with this, guys? Or in other words, if I were to put this on your cost sheet, if I were to put this on your cost sheet, right, you have direct material, direct labor, direct expense, gives you prime cost, right? To this add production overheads. Till now we would have accounted for 2,40,000, right? Now here itself you can add your under absorption due to normal reason. How much is it? 5,000 rupees, right? And this gives you your gross works costs and opening WIP, closing WIP, all these things you do it, right? And finally you arrive at your cost of goods sold, right? All the stock gets valued and all, add opening FG minus closing FG, everything. And finally here, what do? We add our AOH, SOH, right? Along with that SOH, now you can add one more line item, under absorption due to abnormal reasons, 75,000. Clear with this, guys? Are you all clear with this? So here, this 5,000 is treated as a product cost, the 75,000 is treated as a period cost. Or if you want to put it in trading P&L account format, literally, guys, in this case, what I do, so here I add 5,000, right? And here I will be adding 75,000. So to the extent of normal reasons, I will treat it as a product cost. It should impact my stock valuation. To the extent of abnormal reasons or due to inefficiencies, it should be taken to my P&L account. Are you guys clear with this? Now, the final touch to this area. Now, there is no problem with respect to this 75,000. That is, if I'm treating it as a period cost, there is no problem at all. P&L, the entire amount will die in this year. Clear with this, guys? But suddenly, if I am introducing a line item of cost at the end of the year as a product cost, now there is one big problem. Sir, what is the problem, sir? Now, recall the flow of cost concept which we have studied in cost sheet. Now, guys, in your WIP area, right, this is where all your line items of cost will appear, right? You have direct material consumed, you have direct labor, direct expenses. Now here is where you will be incurring production overheads, Guys, correct? Now, having incurred all these costs, now what will happen? Some units will be produced and completed. Some units will be completed and transferred to FG, right? Units completed and transferred to FG. Some units will lie in your closing WIP, guys, correct? Now, in your FG area, ideally, whatever units that got completed, right? Now, it could either be sold, right? You have cost of goods sold. It could either be sold or it could remain unsold, closing FG. Guys, are you clear with this? Or in other words, if I suddenly add one line item here, it is going to impact my closing WIP and my units produced, correct? Now, whenever I say units produced, the units produced could either be sold or it can remain unsold. Or in other words, suddenly if I impact one line item here, three figures will take a hit. What are they? The value of units sold, that is cost of goods sold, the value of units unsold, which is your closing FG, and the value of units incompleted. Are you guys clear with this? Because basically whatever I do here will impact units completed and units incomplete, and units completed are represented by either units sold. Whatever units I produce can either be sold or it can remain unsold. Or in other words, suddenly if I introduce 5,000 rupees as a cost here, now this cost now needs to be shared or borne by my units sold, units unsold, and units incompleted. Literally, I need to apportion this cost between these three guys. Are you all clear with this? Are you all clear with this? So now, in this case, our under absorption due to normal reasons is how much? 5,000 rupees. Now this I need to apportion between three guys. Who are they? So goods sold, right? Then goods unsold, that is closing FG, and goods incomplete, WIP. Guys, clear with this? Let us say I have a total of 4,000 units sold, right? And I have a total of, example, 800 units of closing FG, and let us say I have a total of 200 units of WIP, right? Or in other words, 400 units, 50% complete, right? Equivalent units. Sir, 400 units were there, 50% complete. 400 units, 50% complete is equivalent to 200 units fully complete. Guys, clear with this? So now what I need to do, this 5,000 rupees, I need to apportion it between this goods sold, closing FG, and closing WIP in the ratio of 4,000 is to 800 is to 200. Guys, clear with this? Sir, what about that 75,000 rupees of under absorption attributable to your abnormal reasons? No problem at all. That you can directly take it to your costing P&L. That will not impact anything because it's a period cost. Only if I am having an impact on the product cost, three figures will take an hit. Simple. This 5,000, you apportion it between these three figures in the proportion in which they have actually, the units are there. Guys, clear with this? So ideally, I can say 5,000, I need to apportion it between these three in the ratio of 4,000 is to 800 is to 200, right? Ideally, if you do this, this is over. But our institute, they want to do it in a structured format. What they are saying is, first, you compute something called a supplementary rate. What do you mean by supplementary rate? It's nothing but under absorption or over absorption. In this case, under absorption divided by total units. Now, what is under absorption here? 5,000 rupees due to normal reasons divided by, what is the total units? 4,000 plus 800 plus 200. How much is it? 5,000 units. So literally you get how much? 1 rupee per unit. Now this 1 rupee per unit you get as a supplementary rate that you multiply with these respective figures. So you get how much? So 4,000 into 1, right? So you get 4,000 into 1 and 800 into 1 and 200 into 1. Literally you get all these line items right now. So you get how much? It's going to be rupees 4,000. You get rupees 800, and here you get rupees 200. Clear with this, guys? Right? Or in other words, sir, directly if I do it, 5,000, if I apportion it in the ratio of 4,000 is to 800 is to 200, directly I would have got the same answer only. No, sir. 4,000, 800, 200. Yes, but our institute, what they are saying, separately they want to actually compute this, and they want to show that it is a supplementary rate, and then they want you to apportion, right? There is one movie comedy in Tamil. They say இதுக்கு பருத்தி மூட்டை கோடவுன்லயே இருக்கலாம், right? Literally, instead of doing all these things directly, you could have done it, right? But institute wants you to show your supplementary rate, பருத்தி மூட்டை godown, right? Supplementary rate, and show that it is 1 rupee per unit, and then apportion it to the respective units. So now literally what happens, sir, 5,000 rupees I'm treating it as a product cost. Because of this, my cost of goods sold will increase by 4,000 rupees, the value of closing FG will increase by 800 rupees, the value of closing WAP will increase by 200 rupees. Are you all clear with this? And all these issues, sir, why are they arising? Because I am forced to use my predetermined rate. Clear with this, guys? Quickly I will summarize. Predetermined rate versus actual rate we saw. So literally, guys, a company or every company needs to necessarily use predetermined rate, because costing cannot wait till the year end. Costing is a concurrent process. Every time as and when a product gets produced, I need to charge it with an overheads. Because of using that, what happens? Absorbed overheads at the end of the year, you compare it with actual, will not be the same. So absorbed overheads, if it is less than actual, I call it as under absorption. If it is more than actual, I call it as over absorption. Now how do I treat it, sir? This under or over absorption is like a rectification of error. Now we need to introduce it into the books. Yes. How will you do that? Simple. Now overall under absorption, whatever figure is there, classify it into two. If it is happening because of normal price level changes, right, to that extent you treat it as a product cost, and whatever it is, you actually apportion it between three people: units sold, closing FG, and closing WAP, using something called as supplementary rate, பருத்தி மூட்டை go down, right? And on the other side, if it is due to abnormal reason, you should treat it as a period cost, directly take it to costing P&L account. Clear with this, guys? And this is the story of your overall absorption, the concept of absorption costing. With this, the concept of absorption costing completely gets over, even from an accounting perspective. A very important and a technical discussion, right? And generally in a marathon purpose, for marathons, I'm sure not many will explain this in a marathon itself, because it's the core piece of the entire subject, to be very honest, right? But I wanted to once again give you guys the perspective and complete this also, so that you have a complete conceptual clarity as to why we do it here. Fine, guys. Now with this, we will just go and do one numerical example, numerical question. Please take your solved question bank, right? So please take question number 7. Please take question number 7. I think this was a past exam question, right? So it came in for about 7 or 8 marks. So it was a past exam question, a very good question. But for you to crack this, you should have all the knowledge that we have seen till now, whatever we've seen till now. So quickly, it's being summarized in this particular numerical example. Let's get started. So question number 7. ABC Limited manufactures a single product and absorbs the production overhead at a predetermined rate of 10 rupees per machine hour. So 10 rupees per machine hour. So here, simple. Look at this. Predetermined rate they have given. So budgeted rate, this is the absorption rate per machine hour. So the base quantity used is machine hour. See, whatever we have learned, we are literally applying in this question. It's a past exam question, by the way. At the end of the financial year, it has been found out that the actual production overheads incurred was 6 lakh rupees, and it included 45,000 rupees on account of write-off of obsolete stores, and 30,000 rupees being wages paid for a strike period under award. Clear with this? So now basically actual over at 60,000, that included 45,000 and 30,000 in it. Now literally, guys, this 45,000, 30,000 and all, they are not production overheads, they are some abnormal items. So ideally you should reduce these two figures from this, right? And only the net amount you can call it as overheads actually incurred, because these two are not overheads incurred, they're write-off of obsolete stores. Obsolete means they are non-usable, right? Obsolete stores written off. Then some wages paid for strike period and all. These are some abnormal items which should ideally not form part of your overheads. Clear with this, guys? So it should be removed. Next one, we will see how to do it. The production and sales data for the year are given below. FG produced was 20,000. Be careful. WIP stock 8,000 units, and each of these 8,000 units were 50% complete, which means 8,000 units 50% complete is equal to 4,000 equivalent units. Goods sold was 18,000. Be very careful. How many units were produced? 20,000. So literally out of this, they have sold 18,000 units, which means the balance 2,000 units are lying in your closing stock. So closing FG is 2,000 units, 18,000 units were actually sold, and 4,000 equivalent units are lying in your closing WAP. This clarity you should have. Next one, the actual machine hours worked during the period was 48,000 machine hours, and it has been found that 1/3 of the under absorption was due to lack of production planning, and the rest were all attributable to normal increase in the cost. You are required to number one, calculate the amount of under absorption and show the accounting treatment for under absorption. A full-fledged past exam question. Now first one, what is the actual overheads? What is the actual overheads incurred? Sir, 6 lakh rupees. Don't say 6 lakh is the overhead. That included this two items which were ideally not production overheads. There are some, extraordinary items and all. Remove that. 6 lakhs minus 45,000 minus 30,000. Literally 5 lakh 25,000 rupees is the amount of overheads actually incurred. Clear with this, guys? This is the actual. Now, to compute the under or over absorption, you should compare what with what? You should compare your under absorption with you should compare your absorbed overheads with your actual overheads. Right. So now, what do we do here? Absorbed overheads needs to be compared with actual overheads. So now, actual we know it is going to be 5,25,000. So how much is the absorbed overheads? Simple. Predetermined rate was 10 rupees per machine hour. And actually, how many machine hours were consumed? 48,000 machine hours, which means 48,000 into 10, 4,80,000 rupees is what that is going to be your absorbed overheads. Are you guys clear with this? Absorbed overheads. So now I would have accounted for overheads of how much? 4,80,000. But at the end of the year, I noticed how much was actually incurred? 5,25,000. The difference between the two, how much is it? 45,000. What is that? It's going to be under absorption. Clear with this, guys? So the first part of the question, clearly we have computed. Sir, it is an under or over absorption? It is an under absorption. Clear with this, guys? Now, having computed the under absorption, the next thing, what should we do right now? Treatment of under absorption. Now, clearly in this question, they have mentioned, look at this. Look at this. They have clearly mentioned 1/3 was due to lack of production planning, and the balance was due to normal increase in the cost. Which means 1/3 of this under absorption should be, it is due to lack of production planning, inefficiency, treated as a period cost. Right, and the balance you should treat with 2/3 should be treated as a product cost. Look at this. So 45,000 out of this 1/3, 45,000 into 1/3, that is going to be how much? 15,000 rupees should be treated as what? Should be treated as a period cost. Okay, it's given here, period cost. Right, now the balance 2/3, that is 30,000 rupees, should be treated as a product cost. Now, period cost 15,000, what will you do? You will take it to costing P&L account, right? And now, with respect to the balance 30,000, what will you do with this? This needs to be apportioned between three items. This is a product cost. Now, I'm introducing it. It will impact my stock valuation. Three items. Who are they? So, units sold, right? Units unsold, closing FG and WAP. Clear with this? And how will I do it? Using something called as supplementary rate. By the way, guys, each and every solution here, so in your study material, all this chart they have not done. So I have personally improvised a solution in your solved question bank. These were actually done by me so that the presentation is enhanced and you can quickly absorb the concept and practice it the day before your exam, and even during your practice, right? Maybe if you are even 4-5 months away from your exam, even then, right, this book is actually super sufficient. That's how we have actually come up with this particular book, and all these things, the solutions are all actually improvised personally. Clear with this, guys? Now, what do we need to do? With respect to this 15,000, I don't have a problem. With respect to this 13,000, what should I do? I should apportion it between my units sold, closing FG, and closing WAP. Simple. How many units were sold? 18,000. And how many units were lying in my closing FG? It's 2,000. And how many equivalent units in my closing WAP? 4,000 units. That is 8,000 into 50%. If you add up everything, so 18,000 plus 2,000, that's going to be 20,000, plus 4,000, it's going to be 24,000. Guys, clear with this? So now what we need to do, so overall, look at this. FG sold, FG unsold, closing stock, and WAP. If you add 24,000 rupees, it's coming out to, so 30,000 divided by 24,000. So how much you get? So it's going to be 1.25 per unit. So 1.25 into 18,000 is equal to, you get 22,500. 2,000 is equal to, you get 2,500. 4,000 is equal to, you get 5,000. Are you guys clear with this? So now if you add up, you get 30,000, or in other words, this 30,000, since I'm introducing it as a cost, now my cost of goods sold increases by 22,500 rupees, my closing stock of FG increases by 2,500 rupees, and my closing stock of WIP increases by 5,000 rupees. Are you guys clear with this? So now the accounting treatment, how will I do it? This is by way of journal entries, right? Ideally, we cover this journal entry in our cost bookkeeping or your cost accounting standards, right? In the cost bookkeeping, that chapter, the cost accounting standards chapter, cost accounting systems chapter, sorry, cost accounting systems or cost bookkeeping chapter, we do it. So now what was the total under absorption here? 45,000. So here, 45,000 I account, right? Now out of this 45,000, 15,000 rupees is a period cost taken to my costing P&L. So what do? 15,000 rupees should be taken to my costing P&L. Now I incur more cost, hence it gets debited, right? And the balance, look at this, 22,500 increases my cost of goods sold. Ideally, my cost of goods sold goes to my cost of sales account only, right? More details about it we'll see in a cost bookkeeping or cost accounting systems area, right? So 22,500 gets debited because it increases my cost of goods sold, right? Then closing stock of FG value increases by 2,500, so FG account debit 2,500, and my WAP value increases by 5,000, so 5,000 rupees debited to your WAP account. Are you guys clear with this? So these three are because of your product cost, this one is because of period cost. The two put together is your total under absorption now being accounted for. Are you guys clear with this? Now what happens literally, so because of this under absorption treatment, sir, what is the impact on profit? Very simple. Now my profit falls by 22,500 plus 15,000, right? So because of this, so 22,500 plus 15,000, how much is this? 37,500. So my profit reduces or falls by 37,500. How, sir? Simple. Cost of sales is an expired cost, yes, and this period cost component, that is also an expired cost, fully expires, right? These two actually increases my stock valuation only. So literally these two are unexpired cost, it escapes the next year. Are you guys clear with this? So only these two are expired, right? In the current period, these two remain unexpired, so only that cost which expires in the current year gets knocked off against your revenue, hence my profit falls by the sum total of this, so 37,500 rupees. Are you guys clear with this? A very good numerical problem, but for us to do this numerical problem, we had to see a background concept for the last 1 hour in this marathon itself. Clear with this, guys? That is the beauty of this particular chapter, the most technical area of this entire subject itself, I can say. Not just this particular chapter, the most technical area, not only in this chapter, of the entire subject, in my opinion, is this particular concept of absorption, right? Fine. Anyways, so that's about this particular question. Please go and update your library of adjustments. Write down treatment of under absorption. Please write down treatment of under absorption. Treatment of under absorption. Clear with this, guys? Now with this, let's move on to the next one. Look at this, all this explanation I've given here. Treatment of under or over absorption due to normal price level changes should be treated as a product cost. Apportion it to the entire production using supplementary rate. If it is due to inefficiency, take it to your costing P&L, treat it as a period cost, right? What is supplementary rate? How to compute? All these things I've given, and even the journal entry I've given it here. All these things have been neatly summarized, and it has been properly given in your concept decoder book. The question and answers for that I have given it in your solved question bank. Here, that too, solutions personally improvised. Literally beyond this, you don't need anything at all. Trust me, if you do this properly, that is super sufficient in exam. Out of the entire 120 or whatever marks, including the choice questions they ask, literally everything you will be able to solve, right? That's my open challenge to you, because literally I have not omitted anything. Every single thing has been covered here. Clear with this, guys? The next one, the next concept, this is called as blanket rate versus departmental rate. Sir, what is this, sir? I will give you guys an example here, and with the help of this example, quickly we will understand or revise this area. Blanket rate versus departmental rate. What is this particular concept? What is this particular concept? Now, I'm giving you guys an example. Let us say I have two departments in a factory, P1, P2. Departmental overheads, let us say P1 department 20,000, P2 department 15,000. This is the overhead. Let us say the labor hours, I'm using that as the base quantity. Department 1 labor hours is 5,000 hours. Department 2 labor hours is 3,000 hours. Right? Now, I have two products, product A and product B. Right? I have two products, product A and product B. Right? Now, product A, it spends 2 hours, right? Sorry, it spends 3 hours in department P1 and 2 hours in department P2. Product B, this also passes through both the departments, but it takes 2 hours in department P1 and 3 hours in department P2. Now, first, if I use something called as a blanket departmental rate. Now, how will I calculate the absorption rate? Blanket rate is nothing but another way of calculating the absorption rate. What do? I take the total. Look, I am not bothered in which location or in which department of the factory how much is incurred. In the factory, totally blanket. If you put a blanket, what happens? Inside it, what is there is not known, right? So the identity is not known. So totally in this factory, what is the total overheads? 20,000 plus 15,000, sir. 35,000 rupees the total overheads. Okay, fine. And in this factory, what is the total labor hours? 3,000 plus 5,000 plus 3,000, 8,000 labor hours, sir. So now, what is going to be the blanket absorption rate? So 35,000 divided by 8,000. So for every hour spent in the factory, I'm going to charge the product with how much? 4.375 rupees. Clear with this, guys? Now, whether that hour is spent in P1 or in P2, I am not bothered about it. Every unit, right, for every hour that a product spends in the factory, it should be charged with an overhead of how much? 4.375 rupees per unit. Are you guys clear with this? So now, in this case, if I use a blanket rate, you tell me, product A spends a total of how many hours in the factory? Forget P1, P2. Totally it spends how many hours? 5 hours in the factory. Every hour I will be charging it with how much? 4.375. Right? So how much is the overheads? 4.375 into 5. How much is that? So 21.875 rupees the overhead cost per unit of A. How about product B? Sir, product B also overall it spends 2 plus 3, 5 hours in the factory. Right? Every hour I charge it with 4.375. So how much is that? Once again the same, 21.875 rupees is the overhead that I'll be charging for every unit of product B. So whether it is product A or product B, both the products are going to be charged with an overhead cost of 21.875 rupees per unit. So in a blanket rate system, what we do is we don't retain the identity of departments. We take the total factory overheads divided by the total base quantity, arrive at a blanket or a single absorption rate, and using that we charge the absorption to the product. Clear with this, guys? If I do the absorption procedure in a total basis, that is called as what? That is called as blanket rate system. Whereas if I follow a departmental rate, what happens? Department wise I compute the absorption rate. Sir, P1 department overheads divided by P1 department labor hours. How much is it? So 20,000 by 5,000, it is going to be 4 rupees per hour. Right? Which means for every hour a product spends in P1 department, it should be charged with 4 rupees. For P2, it's going to be how much? 15,000 by 3,000. So how much is that going to be? It's going to be 5 rupees per hour. Clear with this, guys? So for every hour spent in department P2, the product should be charged with how much? It should be charged with 5 rupees. So here I will say, sir, product A, it spends 3 hours in P1, 2 hours in P2. So multiply this with 4 and 5 respectively. How much you get? So 3 4s are 12 and 5 2s are 10. So overall, the overhead cost per unit is going to be of A is going to be 22 rupees. How about product B? So here I will multiply this with 4. Here I will multiply this with 5. So here it's going to be 8. Here it's going to be 15. So overall, the overhead cost per unit of B is going to be how much? It is going to be 23 here, and it's going to be 22 here. Clear with this, guys? Whereas if I use a blanket rate system, both the products are charged at a same overhead rate in the overhead cost in this particular question. Clear with this, guys? So, or in other words, calculating the absorption rate department wise is called as departmental rate, whereas calculating the overheads on a total basis, factory basis, is called as what? It is called as blanket rate. Now you tell me, between the two, departmental rate versus your departmental rate versus blanket rate, which is a better way of computing overheads? Now obviously departmental rate is better to compute overheads. Why, sir? There are multiple reasons. Reason number one, if I use departmental rate, right, the overheads is accurately charged to the product. Why, sir? Now you guys tell me, for every hour spent in P1, what is the overhead rate? 4 rupees. Every hour spent in P2, what is the overhead rate? 5 rupees. Now between the two, which is a costlier department? Obviously P2. Now product A spends lesser time in a costly department, or in other words, product B spends more time in a costlier department, right? Obviously, hence it has to be given a more share of overhead cost, right? That is the reason why if you use departmental rate, product B has a more overhead cost per unit, 23 rupees, whereas product 2 has only 22 rupees. Why? Because B spends more time, 3 hours instead of 2 hours, it spends 3 hours in a costlier department. Clear with this, guys? Whereas if I use a blanket rate, I am not bothered about where it is incurred. I just total and say, look, A also spends 5 hours in the factory, B also spends 5 hours in a factory. Every hour I should actually charge it with 4.375 rupees, and I do it here. So both the products get a same share of overheads, while ideally product B spends more time in a costlier department. It should ideally get a more share of overheads, which has been properly captured only in your departmental rate, not in your blanket rate system. Are you guys clear with this? This is reason number one, and the most important is reason number two. If I use departmental rate, I have the flexibility to choose a different base quantity for every single department. Clear with this, guys? For example, department P1 is a machining department, right? Now for department P1, it makes more sense for me to use machine hour as the basis to apportion my overheads. Whereas if department P2 is an assembly department, it makes more sense to use labor hours as a basis. So if I use departmental rate, I can appropriately pick that particular factor which drives my cost, right? And I can use the appropriate base quantity to apportion my overheads properly. Clear with this, guys? Whereas if I use a blanket rate system, I necessarily have to use only one denominator. Clear with this? Because I don't retain the identity of the departments, so I don't have the flexibility to choose a department wise base quantity that actually drives the cost of the respective department. I necessarily need to use only one particular base quantity. Clear with this, guys? Right? So because of these broad two reasons, right, it is better to follow departmental rate than following your blanket rate system. Clear with this, guys? Right? So this is the concept of departmental rate versus blanket rate system. Clear with this, guys? So this was something that I wanted to revise once again here. Look at this. When a single overhead absorption rate is calculated for the entire factory, such an absorption rate is called as factory-wide rate or plant-wide rate or blanket absorption rate. The formula is total overheads divided by total base quantity. Suitable for multiple products requiring different resources and costly but accurate. When overhead absorption rate is calculated for each production department using the appropriate absorption base, it is called as departmental rate. So what is the formula here? Departmental overheads divided by departmental base quantity. Clear with this, guys? Which is more better? Obviously your departmental rate is better than your blanket rate system. Are you guys clear with this? Right? So, and there is one more thing here, which is called as machine hour rate. Machine hour rate is nothing but your overheads divided by machine hours. Clear with this, guys? There's something called as a direct machine hour rate. There's something called as comprehensive machine hour rate. Now let us take and do one sum in this concept of comprehensive machine hour rate, and that would be the final discussion in this particular marathon for this particular chapter. Now please go and take question number 9. Please go and take question number 9. We will do something called as comprehensive machine hour rate. Directly we can get into this sum. Comprehensive machine hour rate means what? the total overheads divided by the total machine hours. That's about it. That's about it. So numerator by denominator you need to compute. Look at this. Question number 9. So let's get started here. Let's get started here. So, yes. Now, a machine shop has 8 identical drilling machines manned by 6 operators. There are 8 drilling machines, and 8 machines overall is being managed only by 6 operators, machine operator. The machines cannot be worked without an operator wholly engaged in it. Means what? So only if an operator is engaging, right? Only if an operator is there, the machines will run. Else, the machines will not run without an operator engaging on it. The original cost of all these 8 machines works out to 8 lakh rupees is the total cost. Next, these particulars are furnished for a 6-month period. What are they? Normal hours available per month. In a month, how many hours are available? 208 hours. Absenteeism without pay. So how many hours are leave without pay, for which I am not going to pay them? 18 hours. Leave with pay, how many hours are there? 20 hours, which means 20 hours they don't work, but I have to pay them for this 20 hours. Normal idle time, unavoidable, 10 hours. These are normal idle time, like lunch break, etc. Right? Then average rate of wages per day of 8 hours. How much is it? 20 rupees, which means 20 rupees the labor cost per day of 8 hours, which means per hour how much is it? 20 divided by 8. Clear with this, guys? Next, production bonus estimated on wages. 15% on the wages will be the bonus. Value of power consumed, the figure is given. Supervision and indirect labor, figure is given. Lighting and electricity, figure is given. All these are for a period of 6 months. Now, the following is for a period of 1 year. Repairs and maintenance, 3% of the value of machines. Insurance, 40,000. Depreciation, 10%. Other sundry expenses works out to, work sundry expenses is 12,000 rupees. The general management expenses allocated 54,530. You are required to work out the comprehensive machinery rate for the machine shop. Basically, what do you mean by comprehensive machinery rate? The total costs of this running this particular machine, right? That includes the salary payable to whom? This machine operators. We need to pay the 6 operators, right? So the total cost. So machine operator salary plus power, supervision, lighting, repair, insurance, everything put together, right? Divided by the total hours for which the machine is running. Now, guys, now there are 2 things involved here. First, now the total time for which the machine hours, the total machine hours. How will we compute? Simple. They've clearly given the machines cannot be worked without an operator wholly engaged on it, which means the effective working hours, the effective time for which the 6 operators work is equal to my machine hours. Guys, clear with this? Which means normal hours minus absenteeism without pay, with pay, normal idle time. We subtract all these things. The effective time I get is equal to the machine hours. Clear with this, guys? However, for the purpose of computing how much is the amount salary that I need to pay to them, now for that purpose I need to separately compute the hours for which I need to pay them, no? Because leave with the pay means what? For these hours they are not working, however I need to pay them for this. Clear with this, guys? So we need to compute the hours for which I'm going to pay them and the hours for which effectively they have worked. Why do I need to compute the hours for which I'm going to pay them? Because in the numerator, one of the costs is going to be my machine operator salary. Why do I need to compute the effective hours for which they have worked? Because this is equal to my machine hours. Are you guys clear with this? Which is useful for my denominator. You need to have this clarity. With this, you can crack this sum. Clear with this, guys? So first, what is the normal available hours, right, for 6 operators in 6 months? Now look at this. The normal hours available per month is how much? 208. It's given per month. So which means you need to do what? 208 hours are available for 1 operator, right, for 1 month, which means 208 hours are available, right, for 6 months. Right? So 208 is the machine hours, the total hours available per operator per month. So into 6 months, 1248 is the total hours available per operator, but 6 operators are working on it. So into 6 once again, so the total normal hours available is how much? 7488. Now clear with this, guys? Next, what have they given? Absenteeism without pay. How much is it? 18. Now understand here, have they given per month? No. Which means totally every operator takes 18 hours for the 6-month period put together, which means totally, how much is the absenteeism without pay? 18 hours into 6 operators. So 18 into 6, it's going to be 108. Clear with this, guys? Now, so this normal hours minus absenteeism without pay, if you subtract 7488 minus 108, you get how much? 7380. So I need to pay them. The paid hours is going to be 7380. I will have to pay them for 7380 hours. Clear with this, guys? From this, further subtract leave with pay. Means what? Sir, 20 hours. Every operator will not work for a span of 6 months put together. So 20 into how much? So 20 into 6 operators, 120 hours I need to subtract. Wait, for this 120 hours also I will pay them. Clear with this, guys? That's why I already calculated paid hours. From the paid hours, further I am subtracting leave with pay and normal idle time to arrive at the effective working hours. Means what? This is the number of hours for which I am going to pay them, useful for calculating my machine operator salary. Whereas the 7200 hours is the effective working time, which means this is equal to my total machine hours. Are you guys clear with this? Right? This is why we are computing it after the paid hours. Clear with this, guys? So leave with pay is 20 to 6. And what is the normal idle time? Sir, 10 hours, sir. In a span of 6 months, every worker, normal idle time, unavoidable is 10 hours. So 10 hours into 6, it is going to be 60. So 7380, I'm going to pay them for 7380. Minus 120 minus 60, effectively you get they work only for 7200 hours, which means for only the hours effectively worked, the machine will be functioning. So this is equal to the machine hours. However, I need to pay them for 7380 hours. Why, sir? For these two components, though they are not working, I have to necessarily pay them the labor cost. Are you guys clear with this? Right? So now, as the machine cannot be worked without an operator wholly engaged on them, therefore the effective working hours of the 6 operators for 6 months are the hours for which the machines can be used. Hence 7200 hours represents machine hours. This note clearly indicates the understanding of concept here. Now, next one, what is going to be my operator's wages? Simple. I am paying them 20 rupees for every 8 hours worked. Correct? 20 rupees for 8 hours worked. So 20 divided by 8. So that's going to be 2.5 rupees per hour. This is the wages that I'm going to pay him. Guys, clear with this, guys? Yes. So which means totally I'll have to pay them how much? So for all the 6 operators put together, I have to pay 7380 into 2.5. How much is that? That is going to be 18,480. So 18,480 rupees is actually my machine operators wages for 6 operators put together for a period of 6 months. Are you guys clear with this? The first line item is sorted. Clear with this, guys? Next, what have they given? What are they given? Production bonus is 15% of wages. So on this 18,450, apply 15%, you get 2767.5. That's rounded off to 2768. Clear with this, guys? The next one, all these figures: power 8050, supervision 3300, lighting and electricity 1200. These 3 line items have to be updated as it is. So these are all the costs incurred for 6 months directly given. Next one, repairs and maintenance is going to be 3% of the value of machines. How much is this? 8 lakh. So 8 lakh into 0.03. How much is it? 24,000. But be very, very careful. It is for 1 year. We are only doing the computation for 6-month period. Guys, it's given on the top for 6-month period. So which means half of 24,000, which is 12,000 rupees. Look at this. 3% on 8 lakh into 6 by 12 is going to be 12,000 rupees. Similarly, insurance. How much is insurance going to be, guys? 40,000 per annum. So which means for 6 months it is going to be half of this. It's only going to be 20,000 rupees. Look at this. Insurance 20,000. Next, depreciation. How much is depreciation? 10% on the original cost. So 8 lakh rupees, the total cost of all the 8 machines put together. So 8 lakhs into 10% is 80,000. On this 80,000, only for half a year, it's going to be 40,000 rupees is the depreciation for this period. Clear with this, guys? Why is it 6 months? Because the denominator also we are going to take the effective machine hours for 6 months. In the numerator, take only the cost incurred for 6 months. Clear with this, guys? Then what other thing is given? Sundry expenses works out to 12,000 per annum, which means 6,000 per year. I mean 6,000 for the 6 months, right? And general management expenses they have given 54,530 for this year. So 54,530 right, by 2, or you can say 6 by 12 into 6 by 12, you get 27,265. Add up all these costs, you'll get the numerator. How much is it? 1,39,033. This is the total overheads that you need to actually that needs to be charged, right, divided by the total machine hours. So what is the total machine hours? 7,200. So this needs to be divided by 7,200. So 139,033 divided by 7,200, you get what? 19.3101 something. So 19.31 approximately is going to be the machine hour rate. So the absorption rate per machine hour is going to be the total overheads divided by the total machine hour, which comes out to 1,39,033 divided by machine hours, which is the effective working time for of these the machine operator, which comes out to 7,200 hours. So now it's going to be how much? 19.31 machine hours. Are you guys clear with this? And as simple as that. For us to do the sum, what happened, we had to do this. This is one variety of question. There's no separate concept as such. This is machine hour is just one of the 6 base quantities, but separately they are testing this area alone, where the catch is with respect to the wordings of the problem, nothing beyond that. Clear with this, guys, right? There are many other questions with respect to comprehensive machine hour rate. It's not concept driven, it's just about the catch, the wordings of the question, which we do all the sums in our regular and exam oriented batches. But here, in a revision purpose, I wanted to take one representative question for this concept and solve that also. And with this question is over. So please go and update your library of adjustments. Write down comprehensive machine hour rate. Comprehensive machine hour rate. Clear with this, guys? Clear with this? So with this, we have literally completed all the concepts of this particular chapter, right? So primary distribution is done. Then we did secondary distribution. Look, the format also I've given here. Once you do that and come back, it's easy for you to revise, right? So we have done secondary distribution. Then the different methods and all of secondary distribution I've mentioned here. Absorption. What are the steps involved? We have seen 6 types of absorption rate, base quantities. Predetermined rate is actual rate. Then under or over absorption. We have seen this as well. Then blanket rate versus departmental rate, then machine hour rate problem also, and we have also solved about 5-6 numerical problems, and I've also given many numerical examples as well for the purpose of this particular chapter, and that's a comprehensive revision of this overheads chapter. Guys, clear with this, right? So with this, we have completed this entire revision of this overheads chapter. Now let's move on to the next one. So now let's start the revision of a new chapter, activity-based costing. Now the prerequisite for this chapter is overheads chapter. That is, you should have an idea about your overheads chapter. So it is better to watch your overheads chapter first before you enter into activity-based costing, because this chapter, activity-based costing, is nothing but an extension of overheads chapter. As simple as that, right? Now guys, one more thing, this chapter is a common chapter for CA intermediate costing as well as CMA intermediate paper 12 management accounting. The very same exact chapter is there for both CA and CMA inter in paper 12 management accounting. It is there. So this is also something I want to mention before we get started into this particular chapter. So on this note, let's get started. Now guys, what is the objective of this particular chapter, activity-based costing? The objective of this chapter is to calculate the overhead cost per unit of the product. Sir, what sir? In overheads chapter only, we saw the objective of overheads chapter is to calculate the overhead cost per unit. Right? But once again, we are going to compute the overhead cost per unit only under activity-based costing. Yes. Why, sir? Because there are some serious drawbacks in your traditional costing method, basically your overheads chapter. Now, first we will understand what those drawbacks are, and that is only being overcome under this chapter called activity-based costing. So the drawbacks of your traditional costing method is being overcome using your activity-based costing. If you understand this concept, right, this entire chapter is going to be super easy for you. As simple as that, right? We will also do one numerical problem and we'll close off. It's a very simple chapter provided you have a right application of mind. Clear with this, guys? Now, first, in overheads chapter, we saw that first we have multiple line items of indirect manufacturing cost, right? Let us say, for example, supervisor salary, your factory rent, repairs and maintenance, your depreciation on machinery, and all that. Now, first, what we do primary distribution, and we distribute all these line items to all the departments of this particular factory. Example, P1, P2, P3, S1, S2. Correct? Then what we do? We redistribute back the service department overheads back to the production department. This is what we do. So we redistribute back the overheads incurred in the service department back to the production department. So at the end of secondary distribution, we only have P1, P2, P3 overheads, right? This is called as secondary distribution. And finally, from this, the third step is called as absorption. What we do is that using the concept of absorption, so we convert these bulk figures into overhead cost per unit of the products. The products could be, let us say, product A, product B, product C, product D, and so on. So using the concept of absorption, we calculate what? So we convert these bulk figures into overhead cost per unit of each and every product. This way, we achieve the objective of converting these bulk items into overhead cost per unit of each of the products, and we actually come up with the final objective. This helps us to achieve the overall objective of stock valuation and profit computation. This is what we used to do in our overheads chapter, correct? Right? Which we call it as a traditional costing system. Now, activity-based costing system says the starting point, correct, line items of all your indirect manufacturing cost. The destination is to calculate your overhead cost per unit of each of the product, right? So the starting point and the ending point are same in ABC as well as in traditional costing method, but what is different is only the journey. Activity-based costing says this journey is absolutely wrong, right? Now what we did in traditional costing system, now we apportioned all the line items of expenses to all the departments. Why? Because we took a stand that, look, I incur cost because I have departments, so distributed back to all the departments. From here, the service department were reapportioned back to the production departments, and from the production department we charge it to the product, right? Now ABC says this particular methodology unfollowed under the traditional system follows a serious limitation. What is it? Now, to understand this, let us go back and revisit one concept in overheads which we saw, which was called as your blanket overhead rate versus departmental rate system. We saw that, right? So I will quickly revisit that. From there, if you actually take it forward, that is when the activity-based costing concept will be appreciated in a better manner. Now, we saw this in the concept of blanket rate versus departmental rate, right? Let me refresh your memory with respect to this particular example. Let us say a factory has two departments, P1 and P2. The overheads incurred in department P1 was 20,000. Overheads in department P2 was 15,000. And let us say in department P1 the labor hours were 5,000 hours, and P2 department the labor hours were 3,000 hours, which means the absorption rate for department P1 is going to be 20,000 by 5,000, 4 rupees per hour, and the absorption rate for department P2 was 15,000 divided by 3,000, which is 5 rupees per hour, right? So suppose I am following a departmental rate, means what? Calculating the absorption rate department wise. Right? In that case, how will I apportion or charge the overage to the product? Let us say I produce a product A which spends 3 hours in department P1, 2 hours in department P2. What will I do? For each of the 3 hours, I will charge it with 4 rupees. For each of the 2 hours, I will charge it with 5 rupees. This way, I end up with an overhead of 22 rupees for product A. Product B, let us say, spends 2 hours in department P1 and 3 hours in department P2. Right? So now what do I do? For each of these 2 hours, I charge it at the rate of 4 rupees, and for these 3 hours, I will charge it at the rate of 5 rupees. So if I multiply that, finally, I get an overhead cost of 23 rupees per unit. right? Now, suppose if the company is following a blanket overhead rate system, which means single overhead rate for the entire factory, what will I do? Total overheads for the factory, which is 20 plus 15, 35,000, divided by total base quantity, 5,000 plus 3,000, 8,000 hours, which means a single rate is what I use. 35,000 divided by 8,000 hours, it comes out to rupees 4.375 per hour. Now, how will I charge the overage to the product? Simple. Product A spends how many hours in the factory as a whole? I'm not bothered about department-wise breakup. 3 plus 2, 5 hours it spends the factory. Each of the 5 hours, you give it a share of 4.375 rupees. Department product B, it spends how much? 2 plus 3, totally it spends 5 hours. I'm not bothered about where they spend the hours, right, into a single rate. So you arrive at the overhead per product. Clear with this, guys? Now, between the departmental rate and the blanket rate, which rate is better? We saw that departmental rate is absolutely a better method as compared to the blanket rate system. Why? There were a few advantages. One of the most important advantage is that, look, suppose let us say P1 department is a machining department, P2 department is an assembly department. Now, if I follow a department-wise overhead rate system, then I have the flexibility to choose the appropriate base quantity. For example, department P1 is a machining department. Then to absorb my P1 department's overhead, now it makes sense to use machine hours as the base quantity. Suppose department P2 is an assembly department. Here it makes sense to use your labor hours as the appropriate base quantity. Guys, correct? So I have the flexibility to choose the appropriate base quantity based on the factor that drives my cost. Guys, clear with this? This was one of the biggest advantages of your departmental rate. Whereas if I use a blanket rate, single rate for the entire factory, I necessarily have to use only one. Base quantity. Now that need not be ideally the correct factor that drives my entire cost. Are you guys clear with this? So this was one of the reasons why we saw department-wise absorption rate is better than a single overhead rate for the entire factory. Guys, correct or not? Yes. Now. Let me take an example. Let us say departmental rate is correct. This is where ABC comes and says, even your departmental rate is not correct. Why? I will give you guys an example. With the help of this example, you will have a crystal clear clarity. Let us say department P1, one of the departments in the factory, is a machining department. Clear with this, guys? What does departmental rate, method of absorption rate, what does it say? Simply it says, so take a respective department. For that department, whatever has to be the appropriate base quantity, use that as the base quantity to absorb your overheads. This is what your departmental rate says. Yes. Now, let us say P1 is a machining department. So we'll say the entire P1 department overheads should be absorbed taking the base quantity as machine hours, right? This is what your departmental rate says. Yes. Now, I will give you guys an example. Let us say department P1, right? This is going to be your machining department, right? Let us say this department's overhead was rupees 1 lakh, right? Which means this is a machining department. Machines are available here, and this departmental overhead is going to be how much? 1 lakh rupees. Now, how, sir, 1 lakh you have incurred? I am giving you guys the breakup. Now, out of this 1 lakh, I'm talking, this is 1 lakh is what? Departmental overheads. I'm not even talking about the entire factory overheads. In this entire factory, there is one department called P1 department, which is a machining department. So here the overhead is how much? 1 lakh rupees for this department. Now, how have they incurred 1 lakh rupees, sir? I'm giving you guys the breakup. Now, out of this 1 lakh, right, 60,000 rupees pertains to machine running activity. How much? 60,000 rupees. Then there is another activity incurred inside this department called setup activity. Let us say 15,000 rupees is actually the cost incurred for your setup activity. Let us say I carry out another activity called inspection activity, right? For this inspection activity, in this department, I incur a cost of 25,000. So literally, This department overhead is how much? 1 lakh. The breakup for 1 lakh is 60,000 rupees machine running activity, 15,000 rupees setup activity, 25,000 rupees inspection activity. Clear with this, guys, right? If you add up, you get 1 lakh. Now, logically think, had you used a departmental rate, right, as we studied in overheads chapter, this entire 1 lakh, right, for this entire 1 lakh, we would have taken the base quantity as what? Your machine hours. But however, if you notice, now only this machine running activity, 60,000 rupees is driven. This cost is only driven by your machine hours, guys, correct? Sir, only for the purpose of machine running activity, machine hours can be taken as an appropriate base quantity. Why? Setup activity, 15,000 rupees you have incurred. Setup activity is actually incurred not for your machine time, not based on the machine hours, but setup activity is driven, or it is incurred based on the number of setups you have, or in other words, number of batches you have. Guys, what do you mean by setup activity? Before I start a particular batch, right, I need to set up my machine, and only then I can start my production. For example, let us say I'm starting this video, this session. Before I start up this session, I need to turn on the camera, I need to turn on my MacBook, I need to turn on the lights, another thing, right? Once this particular lecture gets over, I will turn it off. Now, the duration of the lecture is not relevant, right? Here, the number of times I open and close my laptop is when actually I have to once again redo the setup. Clear with this, guys? So here, this setup activity is not driven based on your machine hours. It is completely driven based on a separate base quantity, which is number of setups. Similarly, inspection activity cost is how much? 25,000. It is not driven by machine hours. This cost is actually incurred based on the number of inspections carried out. Are you guys clear with this? Or in other words, right, even your departmental rate is wrong. It said entire 1 lakh, they are assuming it is driven by machine hours, while only 60% of this entire departmental cost is actually driven based on your machine hours, which is your machine running activity, because there could also be certain other activities which are incurred because of certain other reasons, which could not be your what? Which could not be your machine hours. Are you guys clear with this? So literally what your activity based costing says is, first of all, I agree with your starting point, I agree with your destination, but this journey is where I do not agree with what it says. Look, you do not incur the cost because you have departments. Clear with this, guys? So basically, what activity based costing says is that, look, you incur cost because you have activities, or in other words, activity based costing clearly says, look, you have multiple activities. You have multiple activities in your factory. Now, because you have multiple activities, you start consuming resources, and because you start consuming resources, you actually incur the cost. Are you guys clear with this? Hence, what our activity based costing says is that, now do not apportion your cost to all the departments by saying that, sir, I incur the cost because I have a machining department, because I have a production department, I have an assembly department. No. Zoom in further. It is not because of the department that you incur the cost. It is because of activities, right, within every department. That is the reason why you incur the cost. Hence, the correct way of doing is, these line items of expenses should be apportioned to all the activities. First, list out what are all the multiple activities in your company, right? And try to allocate and arrive at the cost for every activity, and for every activity from here, charge it to the products. Or in other words, here we use departments as the basis to actually transfer the costs to all the products, whereas activity based costing says, look, you don't incur all these line items of cost because you have a department. You incur these costs because you have activities, and activities, right, results in consumption of resources, and because you consume resources, you incur cost. Sir, what is it? Example, setup activity I have. Because I have setup activity, right, the resource consumption is the number of setups I have, right? Because I have this activity, there will be multiple number of setups, and since I have multiple number of setup, let us say I am hiring a guy and I am saying I will pay him 100 rupees to actually set up every time I start a session. right? He should come, fix the camera, I mean, turn on the light, turn on the camera, connect, and give me all this iPad, MacBook, everything he should connect, and he should give it to me, right? He should turn on the mic and everything. Every time I start a session, I will actually hire this guy, and let us say I'm paying him 100 rupees. Now I actually do one setup. Now he is set up and he is gone. Now after one setup, whether I record 1 hour or I record for 10 hours in the day, it really doesn't matter, right? Here, this setup cost is not driven by the duration of the lecture. It is driven by the number of times I ask him to come and set up. Guys, clear with this? Or in other words, here the setup activity is an activity, right? The resource consumption is the number of setups, and because you have a resource consumption, it results in what? Incurrence of cost. So this is actually a game changer in the way in which cost gets looked at. Are you guys clear with this? So activity based costing was a game changer in the industry with respect to the perspective at which cost has been looked at. Literally in everyday real life scenarios also, you can actually use the concepts of activity based costing. Clear with this, guys? Now in this particular chapter, what we are going to do, we have multiple activities on the starting point and the ending point. We need to calculate the overhead cost. We should calculate the overhead cost per unit of A, B, C, D, or overhead cost per unit of the product. Now how are we going to do it? Basically, we have multiple line items of expenses on one side, and we have the products on the other side. Now what we do is we arrive at what is the cost incurred for respective activity, and from there, for every activity, we will find out what is the appropriate cost driver. So what do you mean by cost driver? The factor that drives my cost is called as a cost driver, or in other words, in overheads chapter we called it as base quantity. In this particular chapter we are going to call it as cost driver. Some terminology difference. For example, machine running activity. What is the cost driver? The factor that drives the machine running activity is what? Machine hours. Setup activity, the cost driver is number of setup, because the cost is driven by the number of times you set up. Inspection activity, number of inspections. Clear with this, guys? That is called as cost driver. So first we list out the activities. For every activity we arrive at the cost driver, then we calculate the absorption rate, right, per unit of cost driver. What it is and all, we will be doing it with the help of one numerical example. And typically in this particular chapter, the exam question, how it will come like is that they will give a data and they will ask you to compute, right, apportion the overheads, calculate the overhead cost per unit of a product using the traditional costing system, that is overheads chapter, and under ABC. Clear with this, guys? This is how they actually test this particular chapter, and this is what is all the chapter about. Clear with this, guys? So in our concept decoder, all these things I have clearly explained in a very neat manner, right? I have also given you guys the format that needs to be used for our numerical problem. All these things I have separately done, just so that it's easy for you to quickly revisit the day before your exam. What is what? Do not worry. Clearly, we will take up one numerical example, and with the help of this example, we will completely finish this particular question or this particular chapter. Clear with this, guys? Now, please take your question number 1 in your, the CA Inter concept, your CA Inter solved question bank. Please take question number 1. Now, look at this. The indirect expenses expended by a machine shop in a factory during a period amounted to rupees 1 lakh. The machine running time for the period is 10,000 rupees. What are they saying? In a machine shop, right, in a factory, the overall total overheads incurred is how much? 1 lakh. The machine running time, machine hours, is how much? 10,000. The details of the utilization of machine time are as under. I produce 2 products, A, B. Right? How many units? I produce 200 units of A, 100 units of B, and A, totally these 200 units of A consumed a total of 5,000 hours, and 100 units of B consumed a total of 5,000 hours, right? 5 plus 5, overall 10,000 hours was the total machine hours incurred in this factory. Trace the overhead cost per unit to the 2 products using traditional overhead absorption costing system. We need to calculate the overhead cost per unit under the traditional absorption costing system. Right? How do you do? Very simple. Calculate the blanket overhead rate. Sir, 1 lakh divided by 10,000 hours. So how much is it? 10 rupees per hour. And accordingly, you apportion it to the 2 products. You will arrive at the overheads attributable to A, attributable to B, divided by the respective units. You will arrive at the overhead cost per unit of A and B. We will do it. Don't worry. Next. The company collected more details relating to the activity performed by its machine shop. to enable tracing the indirect costs by using activity-based costing system. Now, what have they given? Sir, this 1 lakh, sir, what is the breakup of this 1 lakh? Now, out of this 1 lakh, 60,000 rupees is pertaining to machine running activity. 15,000 rupees is pertaining to setup activity. 25,000 rupees is pertaining to inspection activity. Guys, literally, right now I gave you guys an example, no? This example, whatever I gave you was nothing but I picked the figures from this first question only. Are you clear with this? Right? Now, what they have said, the cost driver means what? The base quantity, the factor that drives the cost. Machine running activity is driven by machine hours. Setup activity is driven by setup time. Instead of number of setups, they are using setup time, right? And inspection activity is driven by inspection time, the number of hours for which the inspection activity was carried out. Clear with this, guys, right? They have given in the question. And the cost driver consumption is given here, right? Totally, sir. Product A consumed total of 5,000 machine hours, B consumed 5,000 machine hours. How about setup time? The product A consumed total of 3,000 setup hours, B consumed total of 2,000 setup hours. How about inspection time? A consumed total of 1,500 hours, B consumed total of 3,500 hours. Clear with this, guys? Now, trace the overhead cost per unit of the two products using activity-based costing system. So, literally, this is how your exam question comes like. So, you need to calculate the overhead cost per unit under the traditional costing system and once under your activity-based costing system. Now, under the traditional costing system, how will you do that? That is the first part of discussion. So, calculating the overhead cost per unit using the traditional costing system. Now, what do you do? Simple. Take the total overheads divided by your total hours, right? Machine hours. So, it's going to be 1 lakh divided by 10,000 hours. It's going to be 10 rupees per machine hour. So, now, what do I do? Sir, product A consumed a total of 5,000 machine hours. B consumed a total of 5,000 machine hours. So what is going to be the total overheads that I'm going to apportion? So 5,000 into 10, which is going to be 50,000 rupees of overheads is attributable to A. 5,000 into 10, 50,000 is attributable to product B. Clear with this, guys? 5,000 into 10, 5,000 into 10. So 50,000 rupees of overheads to A, 15,000 rupees of overheads to B. Now, how many units of A and B have been produced? 200 units and 100 units respectively. So how much is the overhead cost per unit of A? Sir, 50,000 rupees, the total overheads pertaining to product A. How many units of product A have been produced? 200. So 50,000 divided by 200. The overhead cost per unit of A is going to be 250 rupees. Clear with this, guys? Right? So it's going to be, one second. So it's 50,000 divided by 200. Yes, it's going to be 250 rupees per unit. How about product B? So product B share of overheads is 50,000 rupees, right? And this is the cost pertaining to 100 units of product B. So divided by 100. So literally you remove 2 zeros, you get what? 500 rupees per unit. Clear with this, guys? So under the traditional costing system, what you have is that so 250 rupees is the overhead cost per unit of A and 500 rupees is the overhead cost per unit of B. Are you clear with this? As simple as that, guys. Beyond this, there's nothing there beyond this. This is all it takes. Clear with this, guys? The next one. Now let's go on to activity-based costing system. Guys, use this format. This is a beautiful format and you can easily crack the sums with this format, right? So this is a format which I generally use for solving all the sums, right? This is the best format because it is a foolproof approach, meaning you cannot make mistakes easily. Now look at this. First, what you need to do? There are, in activity-based costing system, you have a two-step procedure. Step number 1, calculating your cost driver rate. This is similar to your absorption rate. And step number 2, apportionment of overheads, or in other words, charging of overheads to product. Basically, guys, your absorption, that is the third phase of your overhead accounting, has two-step procedure. Step number 1, calculating your absorption rate. Step number 2, charging of overheads to product. Similarly here, instead of absorption rate, we call it as cost driver rate. Clear with this, guys? And step number 2 is apportionment of overheads to the products. Now, first list out the activities. What are the activities? Machining, setup, and inspection. These are the 3 activities available: machining, setup, and inspection. Now, these are the 3 activities, right? Now, activity wise, how much is the cost? Now, sir, machine running activity cost overall is 60,000, setup activity 15,000, inspection activity 25,000. Clear with this, guys? So this is called as cost pool. Clear with this, guys? What is it called as? Cost pool. Cost pool is similar to there in your overheads chapter. These are all departments. That's how we call it. And we call this as departmental overheads. Here we list out the activities and the costs pertaining to every activity is called as cost pool. Clear with this, guys? Next, you need to write down what is the cost driver name. Clear with this, guys? So what is the cost driver name needs to be written down. So what is the cost driver name here? Now, sir, machine activity is driven by machine hours. Setup activity is driven by setup time. Inspection activity is driven by inspection time. Clear with this, guys? Cost driver name needs to be written. Next, what is the cost driver quantity? This is similar to the base quantity. Sir, overall, this machine running activity is driven by machine hours, right? The 60,000 rupees is incurred for total of how many machine hours? Read the question. 5,000 of A plus 5,000 of B. Overall, sir, in this factory, I have how many machine hours? 10,000 machine hours. Clear with this, guys? So now you can just put it up here. So it's going to be 10,000 machine hours. Similarly, setup time, how much is it? 3,000 plus 2,000. Overall, sir, the cost is incurred for 5,000 setup hours. So you can just write down here 5,000 machine hours. Right? Sorry, setup hours. Then how about inspection? 1,500 plus 3,500. Overall, you get how much? 5,000 inspection hours. Clear with this, guys? It's going to be 5,000 inspection hours. Clear with this, guys? Yes. So now what do you have here? What do you have here? Simple. So now the cost pool, the respective activity cost pool divided by the cost driver quantity, if you do, you will arrive at the cost driver rate. There we call this as absorption rate. Here we call it as cost driver rate. Now 60,000 rupees divided by 10,000 machine hours gives you how much? 6 rupees per machine hour. So literally, guys, 6 rupees per machine hour is the cost driver rate. Are you guys clear with this? Similarly 15,000 divided by 5,000 hours gives you how much? So 3 rupees is the cost for every hour of setup, for every setup hour. Clear with this, guys? So 3 rupees per setup hour. Similarly, inspection, 25,000 divided by 5,000 inspection hours for every inspection hour, right? So for every hour spent for inspection, the cost is going to be 5 rupees. Clear with this, guys? So this way, literally we have found out the cost driver rates for the respective activities. Clear with this, guys? Now once you do that, now what do you need to do? Apportionment of overheads to the respective products. Yes. Now what is it going to be here? So what are the two products the company deals in? Product A and product B. So what you need to do? Particulars, product A, inside that 2 column, cost driver quantity amount, and product B under the 2 column, cost driver quantity and amount. So this is not P1, P2. Ideally speaking, this is product A, this is product B. Now product A, so what you need to do? You need to list out what are all the different activities. Machine activity, setup activity, inspection activity, right? Now product A, what is the cost driver quantity? So sir, product A, sir, it consumes 5,000 machine hours, 3,000 setup hours and 1,500 inspection hours. Just write it down here. 5,000, 3,000, 1,500. Then how about product B? Sir, it consumes 5,000 machine hours, 2,000 setup hours and 3,500 inspection hours. Just listed out here. 5,000, 2,000 and 3,500. Clear with this, guys? Right? So now what do you need to do? Sir, for every machine hour, I should charge the product with how much? 6 rupees. So 6 rupees into 5,000 is equal to, you get 30,000, right? And 5,000 is equal to 30,000. So for every machine hour, I should charge it with 6 rupees. Similarly, setup time, guys. Setup activity. For every setup hour, I should charge the product with 3 rupees. So 3 into 3,000 gives you 9,000. 3 into 2,000 gives you 6,000 rupees. So out of this, overall 9,000 rupees is the setup cost attributable to product A. 6,000 rupees is setup cost attributable to product B. Clear with this, guys? So the total setup cost was 15. Out of this, I properly apportioned 9,000 to A and 6,000 to B based on the setup hours consumed by the respective product. This is a more fair and a rational way of apportioning your indirect cost, because you list out the activities. For every activity you find out the cost driver, right, and based on that cost driver you apportion it to the respective product. It is not a random base. You find out for every activity the factor that drives the cost, called as the cost driver, and you calculate the cost driver rate, using which you rationally and properly apportion it to the product. This is a more meaningful way of charging your indirect costs to your product. So this will result in a better and a fair costing. Are you guys clear with this? Similarly, your inspection. So for every inspection hour, I should charge the product with 5 rupees. So 5 into 1500, 7500. 5 into 3500, it's going to be how much? 17,500. So literally we have calculated the activity wise share of costs for both the products. So now 30 plus 9 plus 7,500 is 46,500 rupees for A. 30 plus 6 plus 17,500, 53,500 rupees is the cost of overheads attributable to product B. Clear with this, guys? So now what do you need to do? So this is the total cost of overheads for how many units of A? 200 units of A, which means how much the cost per unit? 46,500 by 200 gives you 232.50. Right? This is the overhead cost per unit of A. How about B? It is going to be 53,500 divided by 100 units. Similarly, just simply remove 2 zeros, get 535 rupees per unit. Clear with this, guys? Right? Now, if you look at it, had you used your traditional costing system, the overhead cost per unit of A was how much? 250. Whereas here it is how much? 232.5. It is ideally less. Clear with this, guys? Now based on this only, you value your stocks, because your stocks are valued generally at full manufacturing cost. Prime cost components are at actuals, right? On top of this, you had overhead cost per unit. Now if you use your traditional absorption costing system, it results in a wrong costing of product, whereas this 332.5 rupees is a more appropriate and a more accurate way of charging your overheads to the product. This will result in wrong costing if you follow your traditional costing methodology. This is what your activity based costing says. Clear with this, guys? So 232.5 for product B. Under the traditional system, it was how much? 500 rupees. Now it becomes 535. Ideally speaking, every unit of B should get 35 rupees more share of cost of overheads. Clear with this, guys? Had you followed your traditional costing system, you would have undervalued or undercosted your product B, and product A, you're giving a share of 250, while actually you should be giving only 232. You are over costing your product A. Are you guys clear with this? This will result in wrong costing of products, so wrong valuation of stocks, wrong fixation of selling price, because cost plus profit is equal to selling price. Literally, this entire company will get into a mess because of a wrong way of apportioning your indirect cost to the products. Are you guys clear with this? And this is what your overheads, this is what your activity based costing pinpoints and rectifies. Clear with this, guys? Basically, this chapter is nothing more than a refined version of your activity based, of your traditional costing system, right? So please go and update your library of adjustments. Write down question number 1. Please write down question number 1. Write down question number 1. Calculation of overhead cost per unit, under traditional costing system. If you want, you can use a short form TCS. This is just for our understanding. Traditional costing system, TCS, and activity based costing, ABC. Under TCS and ABC. Clear with this, guys? Right? That's about it. Right? So overall in this chapter, there's only this concept. Based on this, there are multiple variety of problems which we generally solve in our regular and exam oriented batch. But here, for the marathon purpose, I explained the concept and one representative sum we did here. And one more thing I want to tell you: the difference between your traditional costing system and your activity based costing system in the terminologies. So traditional costing system, activity based costing system. There we use departments to apportion your overhead cost. Here we use activities, right, to apportion your overhead cost. Number 2, there we call it as departmental overheads. Here we call it as activity cost pool. Clear with this, guys? In the overheads chapter, we use the word base quantity. Here we use the word cost driver quantity. In your traditional costing system, your overheads chapter, we use the word absorption rate. Here we use the word cost driver rate. That's all it is. That's all it is. So here this chapter says your cost is not incurred because you have departments. It is incurred because you have the activities, and activities, if you have activities, it results in consumption of resources, and consumption of resources results in incurrence of cost. Hence, just because you have a name board saying department 1, department 2, department 3, don't think because of the department the cost has been incurred. Zoom in and see inside the department there are multiple activities. It is because of these activities that the costs are incurred. List out the activity. For each activity, arrive at the cost pool, that is the cost associated with the divide for that activity. Find out what is the factor that drives the cost, called as cost driver. For each and every activity, calculate the cost driver quantity, divide the cost pool with the cost driver quantity, arrive at the cost driver rate, and using this cost driver rate, charge it to the product using the base quantity consumed. Correct? Or in other words, your cost driver quantity consumed. And with that, this will be a meaningful way of apportioning and charging your overheads to products. Clear with this, guys? And that is all this chapter says. It's fairly a small chapter, but there are multiple varieties of problem based on the concept which we have revised right now. Clear with this, guys? So with this, we have fully completed this particular chapter. Generally, this chapter gets tested almost every attempt, and this is definitely an important chapter. So on that note, so this particular chapter is over. So now let's move on to the next one. So now let's get started with another chapter called as cost accounting systems, right? Now, this chapter is a common chapter for CA and CMA students. In CMA, this chapter is called as cost bookkeeping. In CA intermediate, they call it as cost accounting systems. That's all is the difference. But for that, the content is exactly the same for both the courses. Now, shall we begin, guys? Yes, let's get started. Now, in this particular chapter, overall you have 3 different segments. Segment 1 is called as non-integrated system. Segment 2 is called as integrated system. And segment 3 is called as reconciliation of costing profits and financial profit. Sir, first of all, sir, what is this chapter talking about? Now, quickly, we will just revise this entire chapter, right, with all the concept and every single discussion. Now, guys, first of all, this chapter talks about preparation of your costing books, right? Preparation of your costing books of accounts. Now, or in other words, I can say that this chapter is exactly same as your cost sheet chapter with only one difference. There, we prepared the costing records in a statement format. Here we are going to prepare the costing records in a ledger format with a formal accounting system of debit and credit, right? Now, before that, first, who needs to maintain books of accounts? Let's say your father is a salaried person. Now, will he prepare P&L balance sheet and all? No. Why? Because the law does not require your salaried individuals to maintain books of accounts and all. Then, sir, if I'm running a business, right? So am I required to maintain books of accounts? Yes. Where is it maintained? Where is it mentioned? More specifically in the Companies Act. There is a section called section 128 of the Companies Act that says every company needs to maintain books of accounts at the registered office, right? Now, what do you mean by books of accounts? That is defined in section 2 clause 13 of the Companies Act. It says every company needs to maintain records with respect to their income and expenses, that is called as P&L account. Then receipts and payments, that is called as cash flow statement. Assets and liabilities, that is nothing but your balance sheet. And it doesn't stop there. It also continues to say, there is a fourth clause here that says every class of company as prescribed by the central government should maintain records with respect to utilization of material, labor and all other expenses, right, related to production and sale of their goods and services. Basically they refer to utilization or consumption based entries, which is nothing but they refer to cost records. Are you all able to understand this? Who needs to maintain cost records? Only certain class of companies as prescribed in section 148 of the Companies Act. Is that clear, guys? Now this might look like a law session, but you need to understand the reasoning why you are actually studying this subject itself. Is that clear, guys? Right? Hence under section 148 they say that they have prescribed that certain class of companies who meet the threshold, the turnover threshold and all, right, as prescribed by the central government, they need to maintain their cost records in a manner prescribed. There are forms like form CRA 1, CRA 2, CRA 3, CRA 4. There are 4 forms and all. And guys, this costing records, now if you see, the first 3 are financial records, guys, correct? Yes. Now your financial accounts need to be maintained as per accounting standards prescribed by ICAI. Am I right, guys? Our institute, CA Institute. Am I right? Similarly, your cost accounts, basically your costing records, need to be maintained as per cost accounting standards prescribed by the CMA Institute, that is the Institute of Cost and Management Accountants of India, and accordingly they have prescribed 24 cost accounting standards as on date. Is that clear, guys? Ideally, whatever you are studying as a part of your syllabus, for example, treatment of overheads, under or over absorption, whatever it is that you have studied, all these things are as per CAS, cost accounting standards. Are you all able to understand this? Yes. Next one. Now, financial accounts get audited by your chartered accountant, guys, correct? Cost accounts needs to be audited by a qualified cost and management accountant, CMA. Are you all able to understand? Now our subject has 3 objectives: stock valuation, profit computation, decision making and control, and this chapter squarely comes within the ambit of objective A of our subject, stock valuation and profit computation. And ideally, guys, the first objective, stock valuation, profit computation, is called as cost accounting. Objective 2 and 3, decision making and control, put together is ideally called as your management accounting. Is that clear, guys? Right? Now guys, what the law says is that every company which meets that threshold or criteria as prescribed by the government needs to maintain cost records. Am I right, guys? Yes. Now these companies, they have been given a choice, right? They can maintain their cost records either under non-integrated system or under integrated system. There are 2 ways in which your costing records can be maintained. What are they? Non-integrated system and integrated system. Non-integrated system means what? Now you will have a separate team to maintain your financial accounts, separate team to maintain your cost accounts. Are you clear with this? Or in other words, your cost records and financial records are kept separately by 2 different teams. Is that clear? And at the end of the period, the finance team will report financial profit, the costing team will report costing profit. Is that clear, guys? Will both the profits be same? No. Why? In costing, we saw in cost sheet chapter, we only report operating profit. Now certain other non-operating expenses, any cost incurred outside the 3 locations, are not considered in our subject. Non-operating incomes like your rental income, FD, interest, dividend received and all, these are not considered here, right? Certain other parameters are also there. these are not considered here, but they will be considered in financial accounts, guys, correct? Hence, these two profit will be different. Am I right? Hence, at the end of the period, you need to prepare something called as a reconciliation statement. Are you all able to understand this? Yes. Now, understand this will arise when the company is following non-integrated accounting system. Non-integrated system means what? Your costing records, financial records are kept separately. Whereas, if the company is deciding to maintain their costing records in an integrated system, it means that your financial accounts and the cost accounts are maintained together in an interlocked manner. Is that clear for everyone? Now, in this case, there is one team. It prepares a single set of books, hence they report only a single profit. Are you all able to understand? Now, in this case, now I don't have any two profits. Where is a question of reconciliation? Are you all able to understand? Hence, always remember, reconciliation arises only when the company maintains their accounts under non-integrated system. Hence, these are the three learning objectives of this chapter: non-integrated system, integrated system, and reconciliation of costing profit and financial profit. This is applicable only when the company follows a non-integrated system. Are you all able to understand the background of this chapter? Now, with this, let's get started with the first segment called as a integrated accounting system. Now, guys, for you to do this integrated accounting system, what is non-integrated accounting system? I'm sorry. The first segment is a non-integrated accounting system. Now, basically, guys, in this case of non-integrated accounting system, what do? Costing records and financial records are maintained separately. So here, costing records is completely outside the purview of your financial records, maintained separately by a separate costing team. Guys, correct. Now, in this case, now what do we need to do? We need to maintain our costing ledgers. It is nothing but you need to open some ledger accounts, debit and credit. You need to do the posting and all. Clear with this, guys? Now, this is a very simple area, provided you have some fundamental knowledge of your accounts. You guys have fundamental knowledge of accounts? Yes. Now in accounts, what do? Now, there are modern way of accounting. They say there are 5 different items: expense, income, assets, liability, and capital. Guys, correct? Now, expenses and asset, increase of an expense or an asset will get debited, and decrease will get credited automatically. Guys, correct? Now, with respect to income, liability, and capital, increase gets credited, a decrease gets debited. As simple as that. You guys know this? Yes. Now, this is the knowledge that you need to have in accounts. Now, under non-integrated accounting system, costing records are maintained separately. Yes. Now, I will tell you the rules of the game. Now, you need to follow these rules, and overall, in non-integrated accounting system, we will only maintain 11 ledger accounts, which means debit or credit of a particular journal should come only within these 11 ledger. Are you all able to understand? There are only 11 ledgers in cost accounts. That is basically your non-integrated accounts. Is that clear? Now, what are the 11 ledgers? First, stores ledger control account, called as SLC. Then you have WIP control account. We call it as WIP for classroom discussion. FG control account, we call it as FG. These 3 are asset ledgers, stock ledgers. Is that clear? Next, you have wages control account, right? Then you have production overheads account, administration overheads account, selling and distribution accounts. These 4 are expense ledgers. Is that clear? Next, you have a ledger called abnormal loss account. If there is any abnormal losses, you park it in this ledger. Guys, clear with this? It is a loss account. Means what? Any increase in this ledger will be, increase in loss will be debited. Increase in loss will be debited. Guys, correct? Next, you have a cost of sales account. Guys, this is nothing. Recall your cost sheet area. Cost of goods sold plus AOH plus SOH. If you add these 3, you get your total expired cost. That is the total cost incurred. This is called as cost of sales. Guys, correct? This cost of sales should be knocked off against your sales to arrive at the profit. Am I right? Now, what I do, this cost of sales is like a truck ledger. Here, I will load it with cost of goods sold. I will load it with AOH, I will load it with the SOH, collect all the costs, and from here I will take it to my costing P&L account. Is that clear, guys? Right? The next ledger is costing P&L. This is where sales will be on the credit side, and on the debit side all the expenses will be there, and I will arrive at the profit. Is that clear, guys? So these are the 10 ledgers, right? There is 11th ledger called as General Ledger Adjustment, GLA, or this is also known as Cost Ledger Control, CLC. What is this ledger? We will see. Is that clear, guys? Right? So basically there are 3 stock ledgers, RMWPFG, then 4 expenses, wages, POH, AOH, SOH, then abnormal loss, cost of sales, costing P&L, and 11th man is called as a GLA or a CLC. Is that clear, guys? Now with this, what we will do? Now we will see segment wise. I will narrate you the transaction. Within these 11 ledgers, I want you all to tell me the journal entries. Will you guys do that? Yes. Online folks, please participate. Assume I'm standing in front of you and teaching, right? Just attempt, and that's all it is. Shall we get started? Now guys, first, please take your concept decoder book. Now, first, all these things I mentioned here. First, we will see journal entries related to purchase of raw material related entries. Now raw material is getting tracked under which ledger? Stores ledger control, SLC ledger, guys, correct? Now let us say first transaction, I am purchasing raw material. What will be the journal entry? Now if I purchase raw material, asset will increase, so SLC account gets debited. 2, I purchase it from a creditor, let us say to creditor account. Now you tell me, do we have creditor account here? No. Since this creditor account, it is a financial ledger, I don't have a creditor account. If you can't find this ledger within the first 10 ledger, park it under the 11th man called General Ledger Adjustment account. Is that clear? Or this is also cost ledger control, whichever name you want you can use. Is that clear, guys? So, or in other words, these 10 ledgers are what? Your cost ledger. Now suppose if a credit or a debit is coming from your financial ledger, we do not maintain that ledger, simply put it under General Ledger Adjustment account, or it is also known as Cost Ledger Control account. Is that clear, guys? That's all it is, right? So what is the first transaction that we saw? Purchase of raw material entry, SLC account debit. 2, creditors is not there, hence I will take it to GLA. That's about the first line item. Second line item, materials issued to production. What happens? From my SLC, the product gets into my factory shop, WIP. Now what happens? WIP value will be more, so WIP account credit. Now SLC will be, balance will reduce to SLC. Is that clear, guys? So WIP account debit to SLC. Is that clear? Logic, both are assets. Increase in asset gets debited, decrease in asset gets credited. Logic also I'm telling you right now in the marathon itself. Is that clear, guys? Next one. Now maybe there could be a scenario where now these guys, the factory manager, he took some extra materials. Now he's returning it back to the stores. Now visualize what happens when he's returning back to the stores. What happens? Stores value will increase, SLC account gets debited. Now WAP value gets reduced, WAP account gets credited. Is that clear? Entry SLC account debit to WAP, as simple as that. Next one. Now suppose purchase returns, raw material gets returned back to the supplier. Now what will be the entry? Now you guys tell me. When I return back raw material to the supplier, my stores balance will reduce. Am I right? So SLC will get credited. Now SLC will get credited. Now what should be debited? Now when this happens, my creditor value will reduce. Reduction in a creditor, a liability will be debited. Am I right, guys? So I will debit the creditor account, but do we maintain creditor account here? No. Hence, instead of creditor, we will park it to GLA account or CLC account. Is that clear? So the entry will be GLA account debit to SLC. Are you all able to understand this? As simple as that. Please do not mug this up. Please do not mug this up. It is basic, your basic accounts inside costing. That's why it's called cost accounting. Is that clear, guys? Right? Next one. The next line item is direct materials purchased by factory. In exam, they will give you special orders. Sir, what is this, sir? Yes, you guys remember in regular batch we did? Yes, biryani example. Very good. How can we forget biryani? Now, I will explain this example. Now, guys, let us say in your house, there is a place called kitchen, right? And near the kitchen, there will be a storeroom. Now, from the storeroom, generally, your mom, from here only, she will take your rice and pulses, vegetables, whatever required, and she takes it to the production area, which is basically the kitchen. Guys, correct? Now, what happened one fine or not so fine day? Your guests came home and they said, only if there is biryani, we will eat. Now, there is the biryani rice got over. What mom asked, she called you and she asked you to go buy biryani rice, right? Already what she did, cooker, she turned it on with water and all she has put inside. So water is boiling. So the moment you bring that biryani rice, maybe with that she will turn on the cooker and everything else can be done. Now what you did, you went and purchased biryani rice and you came back to home. What will you do? Option number 1, directly give it to your mom. She will cut the packet, put it here. Or option number 2, you will tell, no, I will put it in the store area. You go and take it. Which one will you do? So first, directly you will say, it is an urgent order. Now you please take it and start the manufacturing. In this case, start cooking that right away. Guys, correct? That's what we do. Similarly, in case of some urgent orders, now what happens? I will tell the supplier, look, don't come from this gate. This gate is stores area. I will open another gate for you. There you directly deliver to the factory shop. Why? It might be an urgent order. Guys, clear with this? In this case, what will be the entry? I am receiving raw materials, but directly to my factory shop. Entry, WAP value increases. So WAP account debit to creditor is not there, hence GLA. Are you all able to understand? That is called special order. WAP account debit to GLA. Are you all able to understand? As simple as that. Next one, indirect materials issued for production. What is this, sir? Example, yes, cotton. Let us say I am operating in Tirupur cotton mill or Tirupur cotton textile industry. For me, raw material is cotton, used for converting it into t-shirts or maybe apparels, wearing apparels. Now what I do, suddenly some Ayudha Puja, there was a puja celebration in our factory. Now what happened, we had to clean all the machines. What I did, one bunch of cotton I took, not for converting it into t-shirt, but I used this for cleaning my plant and machinery. Is that clear? Now what I bought as a direct material gets converted into indirect material. Guys, correct? Hence the entry will be what? Production overheads account debit to SLC. SLC gets credited. Why? Stock balance reduces. And this turns into an indirect manufacturing cost. Hence, the entry will be what? Production overhead account debit. Increase in expense gets debited. Reduction of asset gets credited. Is that clear, guys? Logic, you remember. That's about it. POH account debit to SLC. Next, abnormal raw material loss. Obviously, abnormal loss. Let us say there is a theft of theft or any fire. So now your stock gets stolen and all. What is the entry here? Now SLC gets credited because stock balance reduces. Now there is a loss that gets created. So abnormal loss. So entry will be abnormal loss account debit to SLC. Is that clear, guys? That's about it. Finally, transfer of raw material from one job to another job. Now what happens? The entry is transferee job account debit to transfer of job account. Now sir, can you give us an example? What is this? Simple. Let us say I am operating in a job costing sector. Let us say I am operating in a job costing sector. Now what happens? I have stores area. Here I have a WAP area. In a WAP area, what happens? Multiple jobs are being in process. Multiple jobs are being in process. Let us say there are two jobs, job A, job B. Both these jobs require, let us say, a common material. Let us say screws, nuts and bolts. Now from the stores, I actually originally issued these bolts to whom? Job A. Now suddenly job A has excess nuts and bolts. Job B says it wants some nuts and bolts. Now two option. Option number one, from here itself, A can transfer it to B. Or option number 2, B is asking A, please supply. A is saying, no, 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 I will return it to the stores. You go and take it from the stores. Now, if this returning and taking back comes in, it is a waste of lot of time. And remember, for every movement, there will be a cost incurred, guys, correct? Now, what is the ideal thing to do? Here itself, A will transfer it to B, guys, correct? Now, the entry will be what? B is also a WAP, A is also a WAP. All these are WAP subledgers. Is correct. So B, job B value will increase. So job B account debit, receiving job, transferee job. Transferee means the recipient. Transferee job account debit to transferor job. The value of A will reduce. Is that clear, guys? Right. Now you might have a doubt, sir. Transferee job, transferor job are not within the 11 ledgers given. No. Guys, understand. Now let us say you are making sales to Mr. A. He is a debtor. There is another debtor called B. There is another debtor called C. Right? You are making different sales to different people. The entry, though you say, is debtors account debit to sales. Ideally, you will actually say it is not debtor account. You will say A account debit to sales, B account debit to sales, C account debit to sales. That's what we do. Guys, correct? ABC value put together, I call it as debtors. Or here, debtor is a main ledger, ABC are subledgers. Similarly, in this case, WAP is a main ledger, job A, job B, job C are subledgers. Hence, these are all subledgers inside WAP. Hence, the entry will be the receiving job value increases, hence debited, to giving job, so the value reduces, hence credit. Is that clear, guys? As simple as that. That's the reason why we have kept this entry, transferee job account debit to transferor job account. Is that clear, guys? So now with this, we have finished all the journal entries relating to raw material. Shall we move on to the second discussion, which is what? Your wages. Yes, shall we get started? Yes. Now, with respect to wages, there are only two entries. Entry number 1, incurrence of wages. Entry number 2, utilization of wages. What is it, sir? First, I paid wages. Entry will be wages control account debit to cash or bank. I don't have cash or bank, hence put it in GLA. Is that clear? Now let us say I paid 100 rupees. Now out of this 100 rupees paid as wages, let us say 20 rupees is direct wages. Let us say 30 rupees is indirect manufacturing wages. That is basically your supervisor's salary, production overheads. Let us say another, I said 20 direct wages, 30 is production overheads. Let us say another 25 rupees is paid for administration overheads, right? Maybe your office boy salary. Another 25 rupees is paid to salesmen, so it comes under SOH. Now, from my wages account, I need to take these figures to the respective ledgers. Guys, correct? The first entry is what? I build my wages account, wages control account debit to GLA 100. Guys, correct? Now, what will I do? From here, direct wages, I will take it to WAP because it is incurred there only. Direct wages should be taken to WAP. Yes, so I will say WAP account debit. How much? In our example, 20. Then, sir, supervisor salary was 30. Take it to POH account debit. How much? 30. Then, sir, office boy salary we paid. AOH account debit. How much? 25. Then, sales staff salary, SOH account debit, another 25 to wages control account 100. Are you all able to understand? This is what we saw here. So, your WAP account debit, POH account debit, administration overage account debit, selling overage account debit. Now there could also be some abnormal idle time. If there is an abnormal idle time, means what? I paid the amount but I couldn't derive any benefit out of that amount you need to take it to your abnormal loss account. Guys, clear with this? Take it to your abnormal loss account to wages control 100. Is that clear? So basically what happens? Wages control 100 debit, wages control 100 credit, it gets knocked off. It's just a via media ledger. So wages control account you will have 100, I'll say to GLA, and then by I will be having what? WIP, direct wages, right? POH, AOH, SOH, and maybe abnormal loss. I will have the breakup of this 100. So this 100 and 100 gets tallied. Wages control will always tally. Is that clear, guys? Next one, that's about it. Are you all able to understand? Now Now with this, we have completed entries relating to material, entries relating to direct wages also. Now you might be wondering, sir, direct expense is also one of the components of cost, but here we can't see any direct expense ledger, only wages. After that you've gone to POH, AOH, SOH. Where is direct wages, sir? Now guys, let us say direct wages account was there. Now in that case, what will be the entry? I incur direct wages. Direct expense. What will be the entry? Direct expense account debit to cash or bank. I don't have, hence I put it to GLA. Am I right? Now, whatever direct expense cost I incur, I should transfer it to WAP. Guys, why? Because that is where the conversion of RM into FG happens. So, entry will be what? WAP account debit to direct expense. Ideally, direct expense and direct expense gets knocked off. Direct expense ledger, even if you open, you'll create the expense, transfer it to WAP. Guys, correct? Hence, one debit, one credit. What is the need for you to have a ledger? Hence, the net of entry is what? WAP account debit to GLA. Hence, directly, any direct expense, you take it to your WAP ledger itself. So, journal entry will be what? WAP account debit to GLA. Is that clear, guys? Hence, there is no need for you to maintain something called as a direct expenses account. Is that clear for everyone? Are you all able to understand? So, with this, we have finished what all components? Material, direct labor, material, wages, and then direct expense is also done. Is that clear, guys? Now, the main part of discussion in this chapter revolves around overheads chapter. Now, recall our discussion in overheads chapter. It's very, very important. Shall we begin? Yes. Now, overheads, there are three types of overheads. What are they? POH, production overheads, AOH, admin overheads, SOH, selling overheads. Now, as we all know, AOH and SOH are your P&L account items. Period cost means it does not enter into your stock valuation. Whereas POH, this is considered as a product cost, right? So it needs to be considered for the purpose of stock valuation. Is that clear, everyone? Yes. Now, guys, understand, in each of these three types of overheads, there are three phases of overheads accounting. What are they? First, actual overheads. Then you have absorbed overheads. Then at the end of the period, you compare actual with absorbed. You have under or over absorption. A very technical discussion. For you to know this, you should have a complete clarity on your overheads chapter, absorption, how it gets carried out and all. Is that clear, guys? Which you have already seen. Now, first, let me open this production overhead account and show it to you. Now, guys, POH account, how does it look like? First, POH account, indirect materials. For example, that cotton used for cleaning my machines, right? What was the entry? POH account debit to SLC. I would have got it from SLC. Guys, correct. That is an actual POH incurred. Similarly, supervisor salary paid, POH account debit to wages control. I would have received some amount there. Is correct. Next, let us say factory rent paid. That is production overheads I am paying out of my pocket. Entry, POH account debit to cash or bank is not there, hence to GLA. So to GLA, some indirect expenses I pay. Guys, correct? Indirect material plus indirect wages plus, indirect labor plus indirect expenses put together gives you your total production overheads. Am I right, guys? Now, let us say the total production overheads incurred was how much? 60. Now, this amount of debit, it will be happening throughout the year. Am I right, guys? As and when I incur, I will be debiting this amounts. Put together, the sum total of debits comes out to 60. Guys, correct? Now, can costing wait till the end of the year? No. Now, what do I do? Parallelly, as and when a product comes out of the machine, what will I do? I will have to charge these products with my absorption rate. What absorption rate? Predetermined rate into actual base quantity consumed. We've already seen that. Guys, correct? So now, based on a predetermined rate, I keep on charging the products with what? With my absorption rate, with my overheads, guys, correct? Let us say at the end of the year, I notice till date throughout the year, the sum total of all the overheads absorbed was how much? 50 rupees. Now, entry for absorption of overheads. What will happen? absorption is charged to the product. Where is the product getting manufactured? In my WAP area, entry will be what? Now WAP value will increase, so WAP account debit to POH account. Guys, correct? Are you all able to understand? So the entry will be WAP account debit to POH. Why? Because now I remove it as an expense and then I use this to value my product asset. Is that clear, guys? Are you all able to understand? Guys, any problem here? So incurrence entry will be what? POH account debit to GLA. Guys, correct? Now next one. My absorption entry will be what? WAP account debit to POH. Is that clear, guys? Now at the end of the year, what I do? I have incurred 60, but till now I have recorded only to the extent of 50. The balance 10 rupees is treated as an under absorption in this case. Guys, suppose on the contrary, actual incurred was 50 but absorbed was 60, there would have been an over absorption. Whatever we are doing here, it could have come on the debit side. Is that clear, guys? Now this 10 rupees, what will you do? Under or over absorption? In this case, under absorption. Manner of treatment of under absorption, we have already seen that in our overheads chapter. Now because of normal reasons, in that case using supplementary rate, you will apportion it between three guys. Who are they? Units sold, that is cost of sales, units unsold, that is FG, and units incomplete, WAP, using supplementary rate. Guys, correct? If it is attributable to any inefficiencies or abnormal reasons, take the entire amount as a period cost. Take it to costing P&L. You guys are aware of that? Yes, that's what you need to do. Are you all able to understand? So three phases of accounting are there. Phase number 1, actual overheads. Phase number 2, absorbed overheads. Phase number 3, under or over absorption. Is that clear, guys? So now we saw with respect to production overheads. Now shall we do with respect to administration overheads? Guys, AOH. Similarly in AOH, any indirect materials used for materials, if I'm using it for, let us say, corporate office purposes, so entry will be AOH account debit to SLC. Am I right, guys? Guys, correct? Then any director's salary or office boy wages, salaries paid and all, so entry will be AOH account debit to wages control. I would have already got these two figures. We already saw this in material labor related entries. Now I am incurring some, let us say, office rent. Entry will be AOH account debit to yes, GLA, cash or bank, I'll call it as GLA. Guys, correct? So here also I'll be having actual incurred. Guys, correct? Guys, are you all able to understand? Now parallelly, what will I do? I will be absorbing my administration overheads. Guys, correct? But remember, AOH is what? AOH is actually a period cost, should not be considered for the purpose of stock valuation. Am I right? Hence I will take it to costing P&L. Guys, correct? But wait, instead of directly taking to costing P&L, I have a truck waiting. For example, let us say, guys, you are shifting your house. Old house is there, new house is there. In your house, you have so many articles, right? So many articles, utensils you have. Now, two options. Option number 1, take one by one on your head and go and come back and transport it. Or option number 2, call a truck, transfer everything into this truck, single shot, take it to your new house. Which one will you do? Option 1 or 2? Option 2, you will transfer everything into a truck. Similarly here, whatever cost that needs to be taken to my costing P&L, I load it into the truck called as cost of sales. Basically, what will come? Here? Cost of goods. So we saw there, no? Remember, recall format of cost sheet. Cost of goods sold plus AOH plus SOH. I will load it here the truck. This single shot, I will take it to my costing P&L. Are you all able to understand? Hence, what I do, AOH absorption, what will I do? It should be taken entry cost of sales account debit to AOH. Are you all able to understand? Is there any issue here? No. Now what happens here? So if there is any under or over absorption, take it to your costing P&L. There is no multiple treatment here. It is fully treated as a period cost. Is that clear, guys? Right? Similar treatment for SOH. Actuals gets debited. Guys, correct? Absorbed SOH should be taken to SOH account. Any under or over absorption should be taken to your costing P&L account. Is that clear for everyone? Are you all able to understand? So each of the three overheads, we saw three phases. Absorption, actual overheads incurred, absorbed overheads, and under or over absorption treatment. We have seen it. Are you all able to understand? Is there any issue here? No. Now guys, there is one small issue as well. What is it? What is it? Now guys, till now we have seen that AOH should be treated as what? Period cost only. Guys, correct? Which means, is it considered for the purpose of stock valuation? No. However, in some cases, some people, they consider AOH as a part of, product cost, right? For example, CA Inter, we take it as period cost, but in CMA Inter, Institute takes a stand, treat it as a product cost. Not very logical, but yes, this is the method they follow. Is that clear? Now, in this chapter, in CA Inter also, I am saying, in this chapter, in some questions they would have mentioned, AOH is treated as a product cost. Now, in that case, what will you do? There is one small difference. What is it? I will tell you. Shall we get started? Now, if you look at the format of cost sheet, how does it look like? Now, direct material consumed plus labor plus direct expense gives you prime cost plus POH gives you gross works cost, add opening WAP minus closing WAP gives you factory cost. Guys, correct? Now, what they are saying, now guys, here they are asking you to add AOH. Ideally, those 4 addition, 1 deletion will come now. In this chapter, 4 addition, 1 deletion and all will be a part of POH only. Guys, are you clear with this? Right? 4 addition, 1 deletion is only for the purpose of cost sheet. Here they are not keeping all those things. There they wanted to present, that's all. Here everything is a part of POH. I told you. Now, what they are saying, they want, in case you are treating AOH as a product cost, they are saying, add it here. Are you all able to understand? Right? Now, with this, you will arrive at a cost of production. Guys, correct? To this, add opening FG minus closing FG, you will arrive at cost of sales. Or in other words, if you notice in your WAP area, whatever cost you incur, guys, correct? Now, one portion, that is cost incurred in respect of units completed and transferred, called as factory cost. The other one is closing WAP. Am I right? Now, what happens? This factory cost, this enters into your FG area. Am I right, guys? So, in FG area, you have factory cost. Now, if at all you are treating administration overheads as your product cost, they are asking you to add it here. Are you all able to understand? So, this will give you the cost of production. Guys, clear with this? To this, add opening FG minus closing FG. You will arrive at what? Cost of goods sold. Are you all able to understand this? Now, why, sir? This is a treatment. They want to do it. And one more thing, the treatment is different. If you notice, production overheads, if you're absorbing, you take it to WAP account. Whereas AOH, if it is being treated as a product cost, it is taken only to FG account. Why? Because they are saying AOH should be considered to value only your FG. If you take it to your WAP account, it is used for valuing WAP as well as FG. Guys, correct? Are you all able to understand? Hence, here there is a small difference in the way of treatment. Are you all able to understand? And now, if you're preparing that income statement, recall two format statement, two format approach. In that case, sales minus COGS gives me gross profit. From here, I will subtract only SOH. Why? AOH is already considered as a product cost. Is that clear, guys? I will arrive at the operating profit. So, if AOH is treated as a product cost, the treatment will be different. AOH absorbed should be taken to your FG ledger. Are you all able to understand? If that is the scenario, in that case, what will you do? AOH account, whatever you incur, actuals are debited. Absorbed AOH, don't take it to cost of sales ledger, take it to FG account. Is that clear, guys? And any under or over absorption, take it to your costing P&L. Are you all able to understand this? This is a very, very important treatment and adjustment. Is that clear, guys? Since this is a marathon, I am quickly brushing up all the concept. Still, we are doing every single entry and concept here. Are you all able to understand this? Right? So now, first one, your POH, actuals here, absorbed is taken to WIP. Under or over absorption, two treatments can be done. If it is normal reasons, distributed between these three guys using supplementary rate. Abnormal reasons, inefficiency, take it to costing P&L. AOH, what is the issue? Now, actuals are there. Now, absorbed, AOH absorbed. Now, if AOH is treated as a period cost, take it to cost of sales. If it is treated as a product cost, take it to FG account. Any under or over absorption, always taken to P&L, costing P&L. SOH, no problem, always same approach. What is that? Debit actuals On the credit side, you will be having absorbed SOH taken to truck, always cost of sales. It's always a period cost. Balancing figure is going to be your costing P&L. You need to take it. Is that clear, guys? Right? And that's about the treatment here in this area. Are you all able to understand? Is there any issues here? No. This is what I have mentioned here with respect to overheads. If you look at this overheads, production overheads, AOH, SOH, incurred entry, respective overheads account debit to GLA. Clear? Absorption, POH absorbed will be taken to WAP. AOH absorbed will be taken to cost of sales, or if it is a product cost, will be taken to FG ledger, and SOH will be taken to cost of sales. Is that clear? Under or over absorption, these entries we have seen already. Now doubt busters, look at this, very important. In case of over absorption, the journal entry will be exactly inverse of under absorption. Sometimes AOH may be considered as a product cost for valuing your FG. In that case, under or over absorption, this case will impact the FG account instead of the costing P&L account. Just now we did this. Is that clear, guys? And finally, you should also have some other transaction, that is transfer entries. Remember, in our subject, any movement or flow of cost should be tracked. Am I right, guys? Hello? Yes, guys. Are you all clear with this? So now, what will I do? First, now in my WAP, now RM to WAP units are getting transferred now. That we saw the entry in RM area itself. What was the entry? WAP account debit to SLC. Now, from WAP area, some goods can be completed and transferred to your FG area. What will be the entry? FG value will increase, WAP value will decrease. FG account debit to WAP. So this is the journal entry for completed goods. Is that clear? These are transfer entries. Next. Now guys, what happens? Sale can happen. Now always remember, for sales, there are two entries. One entry is for recognizing the revenue. The other entry is for flow of cost. Why is there flow of cost? Now when I'm selling, from my FG, the product goes out. Guys, correct? I need to track the value, cost of goods sold. Am I right, guys? Are you all clear with this? Right? And I should also recognize my revenue. Guys, correct? So for sales, two entries, cost side entry and sales side entry. Now, you look at this. This is very, very important. Let us say the cost of goods sold is 100 rupees and the selling price was fixed at how much? 120. Now, first you tell me what happens with respect to this 100 rupees worth of stock is actually moving out of my FG area. Am I right, guys? What is the journal entry here? Now, first FG account value will reduce. FG gets credited. Am I right, guys? Right? Now, two. Now, there is no cost of goods sold account. Truck is waiting outside. Guys, correct? All the expired costs can be loaded onto the truck. The entry will be what? Cost of sales account. Is that clear, guys? Entry will be what? Cost of sales account debit to FG. That is, there is now an expired cost. Guys, correct? That is cost of sales account to FG. Why FG gets credited? Reduction in asset. Are you all able to understand? Is there any issue here? Guys, you guys are able to understand this? Yes. Next. Now, sir, 120 rupees, sir, is the selling price, I realize. What will be the entry? Logically think. Now, the entry will be, one second, I will tell you. First, normal financial accounts, what will be the entry? I'm making sales. Entry. Debtors account debit to sales. 120. Am I right? Debtor account debit to sales. And at the end of the year, sales account will be transferred to P&L. Am I right? So sales account debit to costing P&L. Am I right? Now, if you knock off sales, one debit and one credit is there. So the net entry will be what? Debtor account debit to costing P&L. Now in our subject, do we have debtor account? No. Hence put it under GLA. Net sale revenue recognition entry will be GLA account debit to costing P&L. Is that clear? Are you all able to understand? This is revenue recognition entry. This is a movement of cost entry. Are you all able to understand? That's what I have mentioned here. So cost of sales of completed goods is going to be cost of sales account debit to FG account. And the sale of completed goods is going to be GLA account debit to costing P&L. Is that clear, guys? Now, with this, all your journal entries in your cost accounting, in your non-integrated accounting is over. Now, once again, guys, I will give you the big picture. Now, sir, I've passed all the entries, sir. Now, how will my ledger look like? How will my ledger look like? Now guys, please focus. This is a closure. This is a closure, gives you a full-fledged closure here. Now I have 3 asset accounts. What are they? SLC, WIP, FG. Then I have 4 expenses: wages, POH, AOH, SOH. Then I have abnormal loss. Then I have truck cost of sales. Then I have costing P&L. Now finally, if you are closing, these 3 are assets. They will be having a closing balance. Am I right? Debit side will be more, credit side will be less. Guys, correct. This is the total raw material available, out of which some I would have consumed. The balance is the closing stock of raw material. Guys, correct. Debit is more than credit, hence I balance the credit side. This becomes by balance brought down. So this is ideally debit balance. Am I right, guys? So I have debit balance in my SLC. This is nothing but value of goods unconsumed, raw material unconsumed. And WAP is nothing but value of goods incomplete. And FG, value of goods unsold. Are you all able to understand? All the 3 will be what? All the 3 will be what? Closing stocks, basically, guys. Closing stock comprises of 3 components. The 3 components of stock: RM, WAP, FG. Are you all clear with this? Next, wages account. Already it gets knocked off, right? One entry for incurrence and utilization. I take it to the respective ledgers. Your WAP, POH, AOH, SOH, abnormal loss and all. Guys, correct? POH account. Actual, absorbed. Any under or over absorption, I take it to costing P&L. Guys, correct? Similarly, AOH, actual, absorbed, under or over absorption, costing P&L. SOH, actual, absorbed, under or over absorption, costing P&L. Guys, correct? Abnormal loss. Now, material abnormal loss, labor abnormal loss. Abnormal loss in labor is abnormal idle time. Whatever is there, I collect it, take it in a single shot to costing P&L. Guys, correct? Next, cost of sales ledger. What will it have? First, it will have the value of goods sold, cost of goods sold. It will get from FG plus AOH plus SOH gives you cost of sales. Take it fully to costing P&L. Is that clear? Now this ledger also gets closed. All are nominal accounts. Now, first in my costing P&L, I have by GLA. This is nothing but what? Revenue recognition entry. By debtors. Instead of debtors, I put GLA. Am I right, guys? Guys, correct? Now, this is my revenue. What is the cost? Cost of sales. I get all my expired cost. Guys, correct? That's nothing but cost of goods sold plus AOH plus SOH. Guys, correct? Then not just this. In this case, we had under absorption. So, in under absorption of AOH, POH, SOH comes here. If it is an over absorption, it will come on the credit side. Is that clear? Then, abnormal loss. Whatever was there, that also gets debited. Guys, correct? Now, overall, I have a profit, a revenue minus all the cost. I will get a profit. So, if the credit is more than debit, there is a profit. If the debit is more than credit, there is a loss. Guys, correct? Now, this loss, where will I transfer? Generally, in accounts, what do we do? Any profits you have, you transfer it to reserves. Entry will be costing P&L account debit to reserves. Now, here, reserve account do I have? No. Take it to GLA. Are you all able to understand? Hence, I will say to GLA, this balance. Now, if you notice, this GLA account, what happens? All these things, debits and credits, this GLA, what is the meaning of this GLA? It is not a single ledger. It is a summary of all your financial ledgers. Every other ledger except the first 10 ledgers is called as a GLA. Is that clear, guys? And GLA will always have a credit balance. That is, the credit will be more than the debit. That's why you have this on the debit side. It will be 2 balance brought down. Is that clear, guys? Now, if you want to prepare a trial balance, now you will be having 3 debits. What are they? SLC, WIP, and FG. Guys, are you clear with this? Right? And this is corresponded with one credit item called as a GLA. Is that clear, guys? Is everyone able to understand? Hence, now what happens? Your trial balance will tally. The total of debit will be equal to the total of credit. Is that clear, guys? And that is all predominantly this chapter says. Is that clear, guys? This is the first segment called as non-integrated accounting. Now, integrated accounting also is over. Sir, how, sir, it is over? Exactly same as a non-integrated accounting system with only one difference. What is that? Now, instead of GLA account, you take it to the respective financial ledger. For example, purchase of raw material entry, SLC account debit to bank or to creditor. Is that clear? So don't take GLA. Are you all able to understand this? Is there any issue here? wages paid entry, wages control account debit to bank. Is that clear, guys? So instead of GLA, if you use a respective financial ledger, that is called as a integrated accounting system. So the journal entries in integrated accounting systems are same as a non-integrated accounting system, except that instead of general ledger adjustment account, the respective financial accounts are debited or credited. Is that clear, guys? And that's about the first two segments of discussion, which is a non-integrated accounting system and integrated accounting system. So now shall we move on to the third segment, which is reconciliation of costing profit and financial profit. Yes, so let's get started. Now guys, let's move on to the third segment, which is reconciliation of your costing profit with your financial profit. Now guys, this reconciliation holds good only if the company is following non-integrated system. Yes, so 1 second, let me just take this up. Yes, this reconciliation applies only when the company reports two sets of profits. And when will the company reports two sets of profit? Only when the costing records and the financial records are kept separately. That is basically in case of non-integrated accounting system. Now guys, in that case, the costing profit and the financial profit, they both need to be reconciled, right? We saw that these two will not be the same. They need to be reconciled, right? Now, before we move on to this reconciliation of costing profit and financial profit, there is one very important thing that you need to know. This is with respect to treatment of under or over absorption of overheads. Right, guys? Now, with respect to under or over absorption of overheads, now till now we have seen two methods. Method number one, if this under or over absorption is due to normal price level changes, we have studied this in our overheads chapter, then in that case, what should you do? It has to be apportioned between your cost of sales, then your FG and WIP, using something called as supplementary rate and all of that. Guys, correct? Right? So the first method is basically what? Basically, it is treated as a product cost. Guys, correct? The second treatment is what? Now, if it is attributable to any inefficiencies or abnormal reasons, treat it as a period cost. Is that clear, guys? Now, there is also a third method of treatment of under or over absorption, right? So we have done a lot of sums in this method as well during a regular batch and even exam oriented batch, but here for the sake of marathon, now I'm setting you the context right before we get into this concept. Now, what is the third method? Eat 5-star, do nothing, right? Basically, what you have to do, don't pass any accounting entries. For example, let us say POH, let us say POH incurred actual is 60,000. Let us say absorbed is 50,000. What is the balance? Under absorption 10,000. What should you do? You don't take it to costing P&L, or you don't apportion it between those three guys using supplementary rate. Just carry it forward by balance carried down. Is that clear? Suppose an over absorption will be 2 balance carried down. Is that clear, guys? That's all. So in this case, what happens? The difference between my under or over absorption will never get accounted. Is that clear, guys? Are you all able to understand? This is another method. Logic for all that I have explained during our regular batch and all. Right now, the logic is not required. This is a method which people follow. So what is the third method? So it's going to be carry forward. Guys, correct? Now, this is the third method of treatment of under or over absorption. Is that clear, guys? Now, if I follow the first two methods, what happens? Actuals I incur. Absorbed overheads is the overheads accounted in costing. Actual will be the overheads accounted in your financial accounts. Absorbed is the overheads accounted in your cost accounts. At the end of the year, I compare the actuals with absorbed. Any difference, I now account it. Guys, correct? That is called as treatment of under or over absorption. Am I right? If I follow the first two methods, the difference is now being accounted. Guys, correct? Hence, if I follow the first two methods, the overheads accounted under financial accounts and under cost accounts will be the same. So because of overheads, there will not be any difference in profits. However, if I follow the third method, what is that? Eat 5-star, do nothing. That is carry forward. In that case, overheads accounted in my financial accounts would have been actual figure. Overheads accounted in costing will be absorbed figure. This under or over absorption never gets accounted at all since it escapes. Hence, this figure is going to be a reconciling item because in my costing, I would have only accounted for 50,000. In financial accounts, I would have accounted for 60,000. This difference, it never enters into my P&L. Hence, this would be a reconciling item if the company is following the third method of treatment of under or over absorption. Are you all able to understand this? Are you all able to understand this? Now, coming back to the main concept, what is this? Reconciliation of costing profit with financial profit. Now guys, why will the costing profit and financial profit be different? Broadly, it can happen only because of three reasons. Reason number one, in costing, we do not consider non-operating items. When I say item, it can be both income and expense. Do we consider any rental income? Do we consider any FD interest received? No. Similarly, do we consider any kind of interest paid, tax paid, dividend paid? No. So all these non-operating items could be a credit or a debit item are considered only in your financial accounts, not in your cost accounts. Hence, this is one reconciling item because of which my costing profit and financial profit could be different. Am I right, guys? Hello, guys, please respond. Yes. Now, the second reason is absorption of overheads. Please be very, very careful. This absorption of overheads can be a reconciling item only when the company follows third method, that is carrying forward. Is that clear, guys? Are you all able to understand this reason we just saw? Is that clear, guys? And finally, stock valuation. Sir, how can stock valuation be a reconciling item? Your financial accounts, the stock figure, we only give them. Costing only provides for the stock figure in financial accounts, guys, correct? But remember, in your financial accounts, AS2, it says your closing stock should be valued at cost or NRV, whichever is lower. Now, the cost figure we give them. Suppose if there is an NRV value and the NRV is lower than cost, then in financial accounts, stock will be valued at NRV. Guys, correct? Hence, the stock valued under financial accounts and cost accounts will be different. Am I right, guys? Are you all able to understand? In that case, stock can be a reconciling item. Are you all able to understand this? Right? So, broadly, there could only be three reasons for reconciliations. What are they? Reason number one, consideration of non-operating items. Reason number two, absorption of overheads if carry forward, if you under or over absorption is carried forward. And third, stock valuation. Now, with this, let us directly go and do reconciliation statements. Now, guys, you guys have done this bank BRS, bank reconciliation statement, right? So you compare, you start with the bank book, arrive at the passbook, or you take the passbook, do addition, deletion, arrive at the bank book, guys, correct? Correct. So now, in this case, what we are going to do, you can either start with costing profit, add less, arrive at financial profit, or you can start with financial profit, add less, arrive at costing profit. Whichever way you want, you can do. Now, with this background, shall we go and do the next sum here? Question number 7. This is an RTP question. So, I just want to take this one question and explain the concept of reconciliation statement. Shall we get started, guys? Yes. A manufacturing company disclosed a net loss of rupees 3,47,000 as per their cost accounts for the year ended March 31st, 2024. The financial accounts, however, disclosed a net loss of 5,10,000. Guys, correct? Now, the following information was revealed as a result of scrutiny of the figures of both the sets of accounts. They have given so many line items of reconciliation. Prepare a memorandum reconciliation account. Forget reconciliation account. Now, let's prepare reconciliation statement. Shall we, guys? Shall we, guys? Just follow what I say. That's more than enough. Now, guys, let's do this sum under the statement approach. Okay, shall we get started? Hello? Shall we get started? Yes. Now, what do we need to do? We need to start with either costing profit and add less, arrive at financial profit, or you can start with financial profit, add less, arrive at costing profit. Both are allowed. Now, in this sum, let's start with costing profit. Okay, guys? Yes. Now, what is my costing profit? What is my costing profit? 3,47,000. Yes. Now, I am just taking it here. 1 second. Yes. My costing profit is going to be 3,47,000. Okay. We'll do something, guys, since we have already done it before. 1 second. Now, we will start with financial profit. Okay. Shall we do that? We'll start with financial profit. How much is my financial profit? Everyone, 5,10,000. So my financial profit is how much? 5,10,000. Right? Now, to this, what do we need to do? Certain line items need to be added. Certain line items need to be subtracted. Now here, if you look at this, net loss as per financial accounts, this amount is there. Certain items need to be added. Certain items need to be subtracted. If you do the net adjustment, you will arrive at the profit as per cost accounts. Guys, correct? Now, line by line, let us read and do this. First line item, what have they mentioned? Factory overheads under absorbed 40,000. Now, wait. Now, how do you do it? I will tell you a hack. Now, guys, now you can have this as, maybe in your rough sheet you can do this. Working note need not be done in exam. Now, what you need to do is put the transaction here. What is the starting point? We start from financial profit. First column you put financial profit. Second column, costing profit. Starting point, destination. And the next column is TBD. TBD means to be done. What needs to be done? What is the first line item, guys? Guys, everyone. Factory overheads under absorbed. Under absorption of factory overheads. Now, logically think. Under absorption means what? Absorbed is less, actual is more. Now, actual gets debited in your financial accounts. Actual is more means in financial accounts there is a more debit. When the debit is more, financial profit is less. Am I right, guys? Relatively, costing profit is more. This is my starting point. I'm starting from financial profit. I need to reach a higher point, which is costing profit. Now, in this case, you will have to add. Are you all able to understand? Guys, is this clear? Very simple, isn't it? Yes. Next line item. So now this is add. So what we do, under add we do under absorption of factory overheads 40,000. Is that clear? Very, very simple. That's all. Next one. What is the next line item? Administration overheads over absorbed. Over absorbed means what? Absorbed is more, actual is less. Actual is less means in my financial accounts I would have debited less amount, hence my financial profit will be more. Are you all able to understand? Financial profit will be what? Financial profit will be more. Costing profit will be less. Why costing profit is less? Absorbed is more debit, which means I would have debited more amount to the costing P&L, which means profit reported is less. From a higher point, you now need to reach a lower point, subtract this amount. Is that clear? Some students, they do, sir, over absorption mean add, either under absorption means subtract. Guys, no. It depends on the starting point and the ending point. Logically, you think. Is that clear, guys? Right? In this case, you will subtract this figure over absorption of AOH. Are you all able to understand? Is that clear? Next line item. What is it? Depreciation charged in financial accounts. Depreciation charged in cost accounts. In financial accounts, 3,25,000 was debited. In cost accounts, 2,75,000 was debited. Now, subtract. The difference between the two is how much? Guys, everybody, 50,000. Now, you tell me, financial accounts charged more depreciation. Cost accounts charged less depreciation. The difference is how much? 50,000. Financial accounts charged 50,000 rupees more. More debit in financial accounts means lesser profit. Financial profit is less. I need to reach costing profit, which is more. From a lower point, reach a higher point. Add. Are you all able to understand? Difference in depreciation. Financial profit less. Costing profit more. Low to high. Add. Is that clear, guys? So we can just mark it here. Difference in depreciation should now be added. Are you all able to understand? Very simple, isn't it? Logically think and do. That's about it. And guys, in the marathon itself, I'm doing this sum. Now, these kind of questions you can expect in an exam. Next one. Interest on investments not included in cost accounts 96. Tell me, what should you do? Financial profit will be lesser. Interest on investments mean I receive. So, credit item there in financial accounts, hence financial profit is more, costing profit no credits, sir, hence it is less. Higher point to lower point, subtract. Simple. Look at this. Interest received on investment, financial profit is more, costing profit is less, higher to low, subtract. So this comes under a subtraction item. Are you clear with this? Next line item. Income tax provided. Now in our subject, do we do we create an expense for income tax? No, but income tax is debited in your financial accounts, which means more debit in financial accounts refers to lesser profit. So financial profit less, costing profit is more, lower point to higher point, add. So add this amount. Are you clear with this? Income tax comes under add. Is that clear? Next one. Interest on loan funds in financial accounts. Do we in costing, do we consider interest? No, EBIT only we report, operating profit, right? It's a finance cost, not considered. So financial profit will less. Exactly. Why? Because amount debited, guys, correct, in your P&L. So lower profit. Costing, this amount does not get debited. So it is a higher profit. Low to high, add. So what do you have here? Interest on loan comes under add. Is that clear, guys? Next one. Transfer fee. What do you mean by that? We don't know. They have given it is credit in financial books. Means what? Some non-operating income. Your financial profit will be more. Costing profit is less. High to low, subtract. That's about it. So look at this. Transfer fee comes under less. Next one. Stores adjustment. What is that? We do not know. Credit in financial books. So financial profit is more. Costing profit is less. High to low, subtract. That's about it. Clear? Next one. Dividend received. Once again, non-operating income. So financial profit, more credit. Costing profit less. High to low, subtract. 32,000 here comes under less. Is that clear, guys? Now what do? Add all the sums. Get 3,89,000. Add all the subtractions. You get 2,26,000. So existing financial accounts loss is negative 5,10,000. From this, add this figure, subtract this figure. Now the net amount you will get is exactly a loss of 3,47,000. This is as per cost accounts. If you want, you can go and check. It is exactly matching with the 3,47,000. Is that clear, guys? You arrive at the figure and compare it with this. Is that clear for everyone? Is that clear for everyone? Guys, are you all able to understand? Any issues, any problem here? No. No. Once again, we did it under statement format, no? Now, suppose they are asked you to prepare a memorandum reconciliation account. Don't worry, nothing great. What you need to do, simple. You put it in a statement format, debit, credit. Guys, correct? Now, you can start with anything, same thing. Here we started with financial profits. There, in the question, they have started with the costing profit. No problem. Guys, correct? Now, let us say the same question, we have to do it under statement approach. Simple. First, you're starting with the financial profit, no? Profit or loss? It is a loss. Had it been a profit, this is as good as a nominal account. It's like a P&L account only. Had it been a profit, you would have credited it. Since it is a loss, you will start here. Guys, correct? All additions will be credited. All deletions will be subtracted. And whatever is the balancing figure, it will be the profit or loss as per the other one. Are you all able to understand, guys? In this question, they started with costing profit, arrived at financial profit. Hence, our addition will be deletion for them. Ulta no completely. They would have started with costing and they would have reached destination is what? Financial profit. Simple. If you start from costing and reach financial profit, now instead of low to high, it would have been starting point to ending point, high to low. Guys, correct? Whatever is addition becomes a subtraction there. Whatever is subtraction becomes addition there. Guys, ultimately the answer will change. Answer will be the same. Are you all able to understand? Guys, starting and ending point can be anything. Simple. The same question, if they are asking you to prepare it under the statement approach, what will you do? Since it is a loss as per financial accounts, you will start it from here. All additions, put it on the credit side. All deletions, you put it on the debit side. The net loss will be here. Are you all able to understand? As per cost accounts. Are you all able to understand? Why loss? That is the reason why you have debit is more than credit. That's the reason you have here. Are you all able to understand? Is there any problem here? Are you guys able to understand? So statement approach means instead of plus or minus, it is credit and debit. Is that clear, guys? And that's about this entire segment of reconciliation statement. Please go and update your library of adjustments. Write down reconciliation of costing profit and financial profit. That's all. Reconciliation of costing profit and financial profit. Right, guys? Fine. So with this, literally, the revision of this entire chapter, cost accounting system or cost bookkeeping, is completely over. We have seen all the 3 segments of discussion in this chapter. Segment number 1, your non-integrated accounting system. Segment number 2, your integrated accounting system, which is nothing but non-integrated accounting system. Instead of GLA, put it in the respective financial ledger. And number 3, we saw what? Reconciliation of costing profit and financial profit. This is applicable only when the company follows non-integrated system. And that's about this entire chapter, guys. Fine. So with this particular chapter is over. Let's move on to the next one. So now let's start the revision of the next chapter, employee cost and direct expense. So this is a much awaited chapter because I've seen so many students who have commented on the comment section, like asking me for the revision of employee cost chapter. So yes, so then I considered, fine, let's do a full-fledged revision of this chapter, employee costs and direct expenses. Now guys, once again, this is a common chapter for CA and CMA students. Now in your CMA intermediate students, this direct expense is not there. It's taken as a separate chapter. But in CA Inter syllabus, they have given employee cost and direct expense. But trust me guys, this direct expense, there is nothing great here, because ideally this is already covered in your cost sheet chapter. Anyways, in this chapter, 2 parts are there, employee cost and the second part is direct expense. In employee cost, these are the learning objectives. We'll be seeing the the components of employee cost. Basically, in your employee cost, your wages, what are all the compositions? It comprises of what? Basic, DA, PF and all of that we'll be seeing. That is a very small thing. The most important aspect of this chapter is wage payment schemes. So you have something called as a time rate system. You have something called as a piece rate system, and then you have something called as bonus plans. And there are 2 bonus plans for our syllabus. One is called as the Halsey premium plan. The other one is called as the Rowan premium plan. So Halsey and Rowan are names of 2 individuals who have given their own manner in which bonus needs to be computed. And then there is a segment called as overtime, treatment of overtime in cost accounts. And then the 4th segment deals with the labor turnover ratios. And then there is also a concept called idle time in labor. That's a very small concept. So for the purpose of our marathon, I will be covering these 4 main important objectives of this chapter. Shall we get started? Yes. Now guys, if you see, you might have studied in your school days or even earlier, there are 5 factors of productions, probably known as 5 M's. Money, machine, men, material and methods. Money, capital. Machine, plant and machines. Men basically is your human resource. Men includes women, right? But excludes children. Child labor not allowed. Okay. Then material, of course, raw material. And methods means technology, latest methodology of converting your RM into FG. Now 5 factors of productions are important. Out of this, if you notice, the only living factor is men, basically human resource. Now the most difficult and the challenging part of any company is to handle human resource, because you do not know what motivates a person. Now an employee can be motivated by way of monetary benefits, money, or there could be non-monetary benefits like promotions, like maybe you increase the responsibility. There could be so many things. Now we are more concerned about the monetary benefit. How do I motivate my workers to make sure that they are working at the peak of their productivity and I extract the maximum work out of them? Is that clear, guys? That's the objective of this particular chapter. Now the first part deals with your components of employee cost. Now employee cost consists of what all? Basic, bonus, allowances, overtime premium, everything you add up. This is called as your gross wages. Guys, clear with this? Now let us say the gross wages comes out to rupees 100, right? Now sir, will I pay this 100 rupees to my employee directly? No. In reality, what happens? Government has made something mandatory. What is that? That is called as PF. Now let us say 100 rupees is the gross wages. This is basic, DA. It could also be all other allowances and all. Government says on top of this 100 rupees, the employer needs to contribute some amount towards the provident fund account of the employee. Ideally speaking, the provident fund belongs to the employee, but he can't take it today. He can take it only at the time of retirement. Is that clear? So now, government says, let us say 12% of his salary, the employer will actually transfer it to his PF account. Whose PF account? Employee's PF account, right? Which means from the perspective of the employer, because he's having this employee, what is his cost? 100 plus 12, that is employer's contribution. Is that clear? Now, how about employee? How much amount the employee will get? Now, government has made it mandatory. Whatever amount the employer is contributing to PF, employee should also contribute to the PF. Is that clear? Now, what you can do? The company can pay this 100 rupees to the employee, and then the employees can, out of this 100 rupees, they can remit their share of 12 rupees to their PF. Guys, correct? Now, government knows this. If you give 100 rupees to the employee, he will spend everything. He will not transfer his share of 12 rupees. Hence, the government says, look, Mr. Employer, you don't pay this 12 rupees to the employee. On his behalf, you deduct 12 rupees and remit that 12 rupees also on his behalf. Is that clear? Hence, what is the cash received by the employee? 100 minus 12. The employee receives only 88 rupees. Now, what will happen? The employer, on top of this 100, he contributes 12 rupees, right, to the PF. This is called employer's share of provident fund. Right, over and above that, employee's share also, he deducts from his share and he remits it. This employee share is not a cost to me. This is ideally a part of 100. Instead of the employee paying it, government is asking me to pay it on his behalf. I'm reducing and I'm putting it there. Is that clear, guys? So literally, the monthly contribution will be 12 plus 12, 24. Guys, but what is the cost to the company? 100 plus employer's contribution. Is that clear? And what is the net cash received by the employee? 100 minus 12. Is that clear, guys? But what is the net amount of cash? I mean, what is the net amount of earnings to the employee? Obviously, it is going to be 100 plus 12. Guys, correct? Or you can say today he receives 88 plus 24 rupees is his savings which he will receive at the time of retirement. So 88 plus 24 comes out to 112. Obviously, the cost to the company is the earnings to the employee. Guys, obviously, you know, one man's cost is another man's income. Guys, you go buy a pack of biscuit. You pay 10 rupees to the shopkeeper and you're buying it. For you, it's a cost. Correct? For the shopkeeper, it's an income. Guys, correct? That's the rule of world. Right? So here, that is a cost, but I'm talking about net cash received. Cash received, he will only receive 88. Is that clear, guys? Now, basically, that's what I have kept it here in the concept decoder book. Look at this. Cost the company will be what? The gross wage is 100 plus employer's contribution to PF, Provident Fund. There's something called ESI. ESI stands for Employee State Insurance. Now, for that also similar treatment is there. So you need to contribute some premium amount for the benefit of employee. Employee should also contribute something that gets deducted and all. Whatever you do in PF, ESI also it is there. The rate is different, right? They will give in the question. So add that whatever amount the employer is contributing, and on top of it, if he is giving any other perquisite, add them. That is going to be the cost from the perspective of company. Is that clear, guys? This is going to be treated as employee cost. Now, how much is the amount that the employee will receive? This gross wages minus all this employee's contribution to PF, ESI and professional tax, income tax and all you deducted. This is the net amount the employee will receive in cash. Is that clear, guys? This is how you compute the wage bill. So when you're talking about it from the company's perspective, this amount is the cost to the company. This will be treated as what? Employee cost. Are you all able to understand? If this employee cost is paid for the benefit of a direct worker, I call it as direct wages. If this is paid for a factory supervisor, I put it under POH. If this is paid for the benefit of let us say an accountant, I will put it under AOH. If this is paid for salesman, I will put it under SOH. Is that clear, guys? Right? The treatment differs based on to whom you pay the amount. but what comprises of employee cost, that will remain the same in all the cases. Is that clear, guys? Right? That is about the first part of discussion. What is that? Employee cost computation. Is that clear, guys? Now, let's move on to the second part, the most important part. What is that? Wage payment schemes. Now, guys, wage payment schemes. Now, broadly, there are two ways in which the wages can be paid. Guys, please understand very carefully. Now, there are two methods in which I can scheme my wage payment. Let us say I am hiring workers to work in my factory. Now, there are two methods through which I can pay. There are two methods through which I can compute the wage amount that I need to pay. Is that clear? The manner of computing the wage bill can be done in either of the two cases. I can only follow one of the two. Right? Clear with this? What is that? One is called as a time rate system. The other one is called as a piece rate system. Now, what are the two? Time rate system. What is it? Simple. I hire workers. I tell them, look, sir, they will ask me the first thing, sir, how much you will pay, sir? That is the first question, no? I tell them, simple. Every day you come to my factory. Yes, correct. Now, whatever is the time you spend inside my factory, that time into whatever per hour I will pay you 100 rupees. Example, in a day they come and they spend 8 hours in my factory, right? I will pay how much? 8 into 100, 800. This will be your wages. Is that clear? If I compute the wages based on the time spent by employees in my factory, this is called as what? Time rate system. Under time rate system, how much will be the wages? Simple. Time taken into time rate. What is time rate? 100 rupees per hour. Are you all able to understand? It is cost is driven by what? Number of hours. Is that clear, guys? Hence, here I mentioned the rate per hour. Are you all able to understand? He spends how much? 8 hours. So 8 hours into 100 per hour gives me how much? 800 rupees. That's going to be the wages. Are you all able to understand? Is that clear, guys? Yes. Next one. No, I don't want to pay wages on the basis of time spent. Now, there is another method called as piece rate system. What is piece rate? Now, I tell my workers, look, I am not bothered about how many hours you spend in my factory, right? Simple. For every unit that you produce, let us say I will pay you 10 rupees. How much? For every unit produced, I will pay how much? 10 rupees. Now, one worker, he produced 100 units. What will I do? For every units you produce, I will pay how much? 10 rupees per unit. So, it's going to be how much? 1000 rupees is going to be the amount I will pay him. Are you all able to understand? Here, the manner of computing the wage bill is not based on the number of hours spent by him in the factory. It is based on the number of output that he produced. Is that clear, guys? Are you all able to understand? In this case, what will be the wages? Units produced into piece rate. Piece rate, how will it be expressed as? So much rupees 10 per unit. So here the cost driver is per unit, the number of units. Is that clear? The cost object here is per unit. Here it is going to be per hour. Is that clear, guys? Is everyone able to understand this? Yes. Now, so looking at the rate itself, you can find out which method the company is following. If the rate is per hour, then they are following time rate system. If it is per unit, then the company is following piece rate system. Is that clear, guys? Is everyone able to understand? Yes. Now, you tell me, between these two methods, which method will motivate the workers to work better? Piece rate. Why? Only if they work and produce a quality output, they will be able to earn more. Right? Whereas the time rate system, they will be inefficient. Come to the office, come to the factory, just like that they do something. Anyway, sir, 8 hours if I stand here, they will pay me. Guys, correct? It's not that easy. Anyway, supervisors will be there. But whatever it is, anyways, they are not motivated to perform better. No. Anyways, even if we perform better, what will you do? You are anyways going to pay me only based on hours spent in the factory. Guys, correct? Now, time rate system lacks an inbuilt motivation. Am I right, guys? Hence, when the company is following time rate system, now what has happened? They can also follow a bonus system. Is that clear, guys? Along with the basic wages, if you are paying them bonus, then the workers will be motivated to work better. Yes. Are you all able to understand? Hence, you have two bonus systems. One bonus plan is given by a man called Halsey. Another bonus plan is given by a guy called Rowan. Is that clear, guys? I'll say, what does he say? Simple. First of all, understand. These two are bonus plans. When will you follow these bonus plan? Only when the company is following time rate system. Piece rate system already has the inbuilt motivation. No need for you to give you additional bonus and all. Are you clear with this? When the company follows time rate system, then a company can follow either Halsey plan or Rowan plan for paying bonus. What does Halsey say? Simple. You pay the basic wages under time rate system. How much is that? Time taken into time rate. On top of that, bonus, how much will it be? 50% of time saved into time rate. This is the manner of computing your bonus. Whereas Mr. Rowan says you pay the basic wages, time taken into time rate, plus the bonus will be time taken by time allowed into time saved into time rate. Sir, what are all these things, sir? We don't understand. I will give a numerical example for you. Now, let us say I have produced 100 units. Guys, let us say I have produced 100 units. Let us say the time allowed is 1 hour per unit. For every unit, you are supposed to take 1 hour. Time rate is what? Rupees 10 per hour, which means what? For every hour you work, I will pay you how much? 10 rupees. Perfect. Now, in this case, what is the total time allowed for the actual output? What is the time you are allowed to take? 100 into 1, 100 hours. Let us say our guy, a worker, has actually taken only 80 hours, which means time allowed was 100, time taken was 80. How much was the time saved? 20 hours he has saved. Guys, correct? Now, if I am following Halsey plan, what is he saying? Anyways, for every hour he has worked, pay the time rate 10 rupees. So 80 into 10, anyways you pay. Guys, clear? On top of that, pay bonus. Sir, how will I pay bonus? He says, how many hours he has saved? 20 hours. Now, on these 20 hours, had he worked, the company had to pay how much? 10 rupees. But he saved this 20 hours. Guys, correct? Now he says, on whatever hours he has saved, 20 hours, 50% you pay as bonus. He didn't work for 20 hours, still 50% of the bonus hours you pay. So he says 50% of time saved into time rate. So 50% of 20 into 10 is the amount of bonus. Is that clear, guys? So 80 into 10 is going to be 800. 50% of 20 into 10, how much is that going to be? 100. So overall, he will be paid how much? 900 rupees. Is this clear? Guys, are you all able to understand? So what is the bonus computed under Halsey method? Guys, come on, everyone answer. 50% of time saved into time rate. Now, Rowan says you pay the basic wages. What is that? Time taken into time rate. 80 into 10, which is going to be 800. Now, he doesn't agree with Halsey. He says, yes, your bonus should be some percentage on time saved into time rate, because that is a total savings he has made for you. Out of that, 50% you're passing on. That is what as per Halsey. But Rowan says, what is the logic for this 50? Why flat 50%? I will give you a manner of computing the percentage that you need to pay. What he says, simple. Time taken by time allowed into time saved into time rate. Is that clear? So he has saved how much? 20 hours into 10. How much percentage? Don't take 50%. I will give you a manner of computing the percentage. What is that? Time taken by time allowed. Time taken is how much? 80. Time allowed is how much? 100. So time taken by time allowed into time saved into time rate. In this case, it comes out to 80%. Are you all able to understand? Guys, so here the basic wage is going to be 800 and bonus is going to be 80 by 100 into 20 into 10. I think this comes out to 18 to 2, which is 160 rupees. Is that clear, guys? So the bonus paid under this system is going to be 800 plus 160. It is going to be how much, guys? 960. Is that clear for everyone? Right? So this is how you compute the bonus. Remember, Halsey and Rowan systems are followed only when the company follows a time rate system. Piece rate system, already there's an inbuilt motivation. You need not motivate them by way of bonuses. Is that clear, guys? Are you all able to understand? Now, there is another doubt which you guys might have. Now, sir, you are saying that these bonus plans will motivate him to perform better. Sir, let us say time allowed is how much? 100. Let us say he actually took 100 hours, which means the time saved is 0. In that case, there is no bonus. Am I right, guys? Am I right? Because in both the cases, time saved will be 0. There is no bonus. Sir, in that case itself, what will be his earnings? 100 into 10, he would have earned how much? 1000. Now, had he taken the normal time, he would have earned how much? 1000. Now, because he's being efficient and taking less time, even under this bonus scheme, Halsey says pay 900, Rohan says pay 960. Now, sir, had he not been efficient, he would have got 1000 rupees now, sir. Then how can you say that these methods are motivating him to perform well? Guys, are you understanding the issue? Now, I will tell you the issue here. No, it still motivates them. I will tell you how. Now, let us take Halsey for example. What is the total earnings, guys, under Halsey? Everyone? 900. Suppose there is no bonus. He took actually 100 hours. 100 into 10, he would have earned how much? 1000. Now, you tell me, he earns this 900 rupees by spending how many hours? 80 hours. Am I right, guys? Whereas this 100 hours he earns by spending how many hours? This 1000 rupees he spends by earning 100 hours. Now, effectively for every hour spent under Halsey, how much he earns? 900 by 80. How much is that? 11.25 rupees he earns for every hour worked. Whereas under a no bonus plan, he earns only 10 hours, 10 rupees per hour. Now, if you look at this, he works only for 80 hours now. For each of the 80 hours, he's earning how much? 11.25 effectively. The balance 20 hours is available. Maybe he'll work for another job. There once again he will earn some bonus and the normal wages. Are you clear with this? So definitely he is being motivated to perform well. Are you all able to understand this? So don't compare the absolute earnings. Here it might be more. Compare it on the basis of effective earnings per hour. Then you will see that these bonus systems will incentivize him to perform well. Are you all able to understand this? Is this clear, guys? Right? Now, I'm just summing it up. First, there are broadly two methods of wage payment scheme. One is called as time rate system. The other one is called as piece rate system. Time rate system. How will you pay the wages? Time taken into time rate, right? Whereas piece rate system, units produced into piece rate. Piece rate is per unit. Time rate is per hour. Now, piece rate system naturally motivates the workers to perform well. Whereas that is not the case with the time rate system. Hence, what should you do? Introduce a bonus plan. Now, there are two different bonus plans. One is called as Halsey plan. The other one is called as Rohan plan. Halsey plan, what he says? Pay the basic wages plus 50% of time saved into time rate. Whereas Rohan says what? What is the logic for 50%? There is no logic. I will give you a manner of computing that percentage. What is that? Time taken by time allowed into time saved into time rate. Is that clear? Pay the basic wages plus this figure as bonus. Is that clear for everyone? Is that clear for everyone? Now, remember this. The first guy, Halsey, says 50%. Rohan has this different method, complicated method of computing bonus. Is that clear, guys? That's all this area says. Fine. Let's go and do one problem here. Shall we? Guys, shall we? Yes. Question number 2. A very, very good sum. This is how your exam questions will look like. Shall we begin? Yes. Now, during 1 week, the workman X manufactured 200 articles, 200 units he produced. He receives a wage for a guaranteed 44-hour week at the rate of rupees 15 per hour. Okay, guys? Yes. So what is he saying? What is he saying? In a week, this guy produced how many units? 200 units. He received wages for how much? 44 hour at the rate of 15 per hour. This 15 per hour means what? They are paid under time rate system. Very good. That is the first observation. So this 15 rupees per hour indicates that he is being currently paid under what method? Time rate system. So this is basically under time rate system. Is that clear? Next. Now, currently, he works for 44 hours in a week. The estimated time to produce one article is how many minutes? 15 minutes. 15 minutes means how many hours? 15 by 60 is 0.25. 1/4. 0.25 hours. So, to produce one unit, you are allowed to take how many hours? 0.25 hours. Is that clear? Yes. Next. The estimated time is given. And under the incentive scheme, the time allowed is increased by 20%. Means what? Incentive means Halsey Rohan, for the purpose of computing the time allowed under Halsey Rohan, increases 15 minutes by 20%. Is that clear, guys? Are you all able to understand? Calculate his gross wages under each of the following methods of remuneration. Number 1, if he is being paid only under time rate, what will be his total earnings? Number 2, if at all he is being paid under piece rate with guaranteed weekly wage. What is guaranteed weekly wage? I will tell you. What will be his total wages? Suppose he is paid under Rohan scheme, how much? If he is paid under Halsey scheme, how much? Under these 4 systems, we now need to compute. Shall we get started, guys? Yes. Simple. If he is paid under time rate. Now, you think, guys, everyone, focus here. In a week, he produces, we are talking about 1 week. He produces how many units? 200. I am following time rate. Am I bothered about how many units he produces? No. Time taken into time rate. How much time you took? 44. What is the time rate? 15. 44 into 15. How much is that? So 44 into 15. So in a month, for this week, you will be paid how much, guys? You will be paid 660 rupees. Is that clear for everyone? Guys, are you all able to understand this? Any problem? No. No. Sir, piece rate, sir. If I am paid under piece rate, how much will it be? Now, piece rate, what is the formula? Number of units produced. Sir, he produced 200 units, sir. Into piece rate. What is piece rate? The rate that he is willing to pay per unit. Now, is the piece rate given in the question? Guys, is the piece rate given in the question? It's not given in the question. So, you need to find out the piece rate. Sir, how can we find out the piece rate, sir? Now, simple, identify this. Now, what are they saying? If at all the company is paying under time rate, they are willing to pay how much? For every hour, they are willing to pay 15 rupees. Correct? Yes. Now, look at this. One more thing they have given. Now, to produce 1 unit, they are allowed to take how many minutes? 15 minutes. Or 15 minutes is nothing but 0.25 hours. Am I right? No. For 1 unit, you are allowed to take 0.25 hours. Which means, in 1 hour, how many units can you manufacture? Simple. 1 divided by 0.25. Guys, correct? How much is that? 4. Simple, pa. For 1 unit, you are allowed to take 15 minutes. In 1 hour, you can produce 4 such units, no? So, in 1 hour, you can produce how many units? 4 units. Now, with this, you can identify the intention of the company. For every hour, they are willing to pay 15 rupees. For every hour, they are expecting you to produce 4 units. Or in other words, they are willing to pay you 15 rupees for every 4 units produced. With this, you can understand the intention of the company. So, if at all the company is scheming a piece rate system, this is how they would scheme it. Guys, correct? Are you all able to understand this? Hence, what will you do it here? So, in this case, what should you do? So, 4 units, they are willing to pay 15 rupees. Or per unit, how much are they willing to pay? 15 divided by 4, it comes out to 3.75 rupees per unit. Is everyone able to understand? This is the step. Are you all able to understand this, guys? Clear with this? Right? So what you can do is, now with this you arrive at the piece rate, which comes out to 3.75 rupees per unit. Guys, are you all able to understand? Now, if at all he gets paid under piece rate system, what would be his total earnings? 200 into 3.75. How much is that? 750 rupees. Is that clear, guys? And that's exactly what's being done here. It's going to be how much? 750 rupees. Are you all able to understand this? Are you all able to understand? Is that clear, guys? Everyone? Yes? Now, look what they have given. So then what is this guaranteed weekly wage, sir? I will tell you. Piece rate with guaranteed weekly wage. Now, under piece rate system, his total earnings comes to 750. Guys, correct? If he is paid under piece rate system, his earnings depends on what? The number of units produced, Suppose in a week, they have a very low demand. Company itself is asking him not to produce much. Now you tell me, in this case, he is ready to work, but the company doesn't want him to produce more units. Sincerely, he will get affected, no? Guys, correct? So what the company will tell him is, look, don't worry. You will be paid under piece rate system. But suppose if the amount as computed under piece rate system, if it comes below the time rate system, 660 rupees, then I will pay under time rate system. Don't worry, you will not be paid less. Or in other words, you are definitely guaranteed of 660. But if the amount that comes under piece rate is more than 660, then I will be paying you under piece rate system. If the amount is coming less than 660, then you will be paid the guaranteed time rate. Are you all able to understand? Or in other words, in this case, so the amount computed under piece rate or the amount computed under time rate, whichever is higher, I will pay him. Guys, correct? Are you all able to understand? If this amount comes to just 550 rupees, example, I will be paying him 660. If it comes out to 600, I'll pay him 660. If it comes to 659, I'll still pay him 660. But if this comes out to 800, then I'll pay him 800. Is that clear, guys? That's what is called as guaranteed weekly wage. Weekly means time rate. So it is piece rate with a guaranteed time rate. Are you all able to understand? Is there any issue here? That's what I've mentioned here in the book. If this piece rate wage turns out to be less than 660, then he will get a guaranteed weekly wage of 660 rupees. Is that clear? Now, next one, what is that? Rowan. Rowan is the second guy. Guys, don't get confused. I'll say Rowan. HR. In alphabetical order, if you see, A, B, C, D, E, F, G, H. H comes first. First one is a easy method, 50. R comes later, complicated method. What is that? Time taken by time allowed into time saved into time rate. Complicated method, huh? Okay. Relatively complicated method. Is that clear? Guys, correct? So the first one, H is flat 50. Simple method. And second, R, HR, human resource. Okay. Remember it like that. Okay. Now, Rowan premium. Now, how will you pay him? Now, in this case, I need to compute what? Guys, what all I need to compute? Come on, everyone. Time taken, time allowed, time saved. Time rate, I already have. Now, time taken, how much time he took? 44 hours. 44 hours. Is that clear? What is the time allowed? Now, look at this. What have they mentioned? What have they mentioned? You have actually produced how many units, guys? 200. Every unit you are allowed to take how much? 15 minutes. But wait, the time allowed is increased by 20% for the purpose of a incentive scheme. Are you all able to understand this? Which means 50 into 1.20 or 120% is going to be the revised time allowed per unit. How much is that? 18, huh? Guys, correct? So 18, you are allowed to take 18 minutes per unit. Guys, are you all able to understand this? Are you all able to understand this? So for every unit, you are allowed to take how much? 18 minutes. Or if you want to convert this into hours, it's going to be 18 by 60. Guys, correct? And actually, how many units have I produced? 200. So the time allowed will be how much, guys? It's going to be 18 by 60 into 200. How much does it come out to? How much does it come out to? This gets knocked off. 6 3s are 18. So 3 2s are 6. It's going to be 60 hours. Guys, correct? Are you all able to understand? Any problem here? So now time allowed is 60. But you've actually taken only 44 hours. Which means you've saved how much for the company? 16 hours. Is that clear, guys? Is that clear? So now if you're being paid under your Halsey or Rowan. First under Rowan. Basic wages. He will be paid. What is the time rate, guys? Time rate. No. Time rate. 15 per hour. Am I right? So anyways, 44 into 15 basic wages. Whether I'm following Halsey or Rowan, I'll be paid. Am I right, guys? So 15 into 44 into 15. How much is that? 660 rupees. Anyways, will be paid. Correct? Next, bonus alone will be different. If I am doing it under Rowan scheme, time taken by time allowed into time saved into time rate. Time taken 44, time allowed 60, time saved 16 into time rate 15. How much does it come out to? 175.9, round it off to 176. So now the total wages under Rowan is going to be how much? 660 plus 176. It works out to how much, guys? It works out to 836. Is that clear, guys? Are you all able to understand? Is there any problem here? You guys are now understanding? Suppose if the same guy is being paid under Rowan's Halsey system. Basic anyways will be the same. Time taken into time rate 15 is going to be 660 rupees. What is going to be the bonus? 50% of time saved into time rate. Now 50% of what is the time saved, guys? 16. So it's going 50% of 16 is going to be 8. So 8 into 15 rupees. How much is that? So it's going to be 120. So 660 plus 120 is going to be how much, guys? Going to be 780 rupees. Is this clear? Is this clear? So we have got all the answers that we want. So simple time rate is going to be 660. Then straight piece rate, simple piece rate 750. If Rowan is followed 836, Halsey is followed 780. Now, sir, under the 4 methods can I follow all the 4 at a time? No. Right? Any one the company has to follow. For a worker, Maybe worker wise they can have difference, but will you be paid first under row 1 and then under, I'll say 2 times they will pay salary? Yeah? No, they will not pay you. Guys, clear? Are you all able to understand? The company has to choose a method. Guys, clear with this? It's a very good question to cover the entire concept of your, your HALSE, row 1 and all the wage payment schemes. Is that clear, guys? Right? Of course, in our regular and exam oriented batches, we'll be doing fully all the sums, but I wanted to take one representative sum and solve it and show it to you as to how it works. Clear with this, guys? Fine, that's about the sum. Please go and update your library of adjustments. Right now, comprehensive sum on time rate, piece rate, HALSE and row 1. Comprehensive sum on time rate, piece rate, HALSE and row 1. Done? Right. Fine, guys. So that's about this particular question. Now, guys, let's move on to the next segment of discussion, which is regarding treatment of overtime. Treatment of overtime. So all these things we have done, every single sum we have worked out during our regular class. In fact, our regular class students are sitting happily here. Okay. Right? Now, let's start, guys. So now, let's move on to the next one, which is called as a treatment of overtime. A very important discussion. Now, guys, what do you mean by overtime? What do you mean by overtime? Overtime refers to what? Working beyond your normal working hours. Let us say my office is between 10 a.m. to 6 p.m. If they are asking me to work before 10 a.m. or after 6 p.m., that time is called as overtime. And let us say my office timing is Monday to Friday. If they are asking me to work on Saturdays, Sundays, that is also overtime. Any time beyond my office hours is called as overtime. Now, when you are making your workers work during the non-office hours, now obviously you will have to pay them a little more than what you generally pay them. Guys, correct? Now, that extra amount that you pay is called as a overtime premium. Is that clear? I will give you an example. Let us say, guys, the normal wage rate is 100 rupees per hour. For every hour the worker works, he will be paid how much? 100. In a day, generally he should work only for 8 hours. But what happened? I made him work for 10 hours, which means I made him work for these extra 2 hours. For these 2 hours, you tell me, I pay him 100 or slightly more than 100? More than 100. Let us say I pay him 1.5 times the normal wages, which is I pay him 150 rupees. Is that clear, guys? Is that clear? Now, what will be the total amount of wages I will be paying him? Now, guys, this will be first normal hours, 8 hours at the rate of 100, 800 rupees, correct? Next 2 hours beyond the office hours at the rate of how much? 150. The amount will be how much? 300. What is the total amount? 1100. Now understand, this 800 is called as a normal time wages. This 300, which whatever amount I paid for those 2 hours extra, is called as overtime wages. Now, guys, please understand. What is the total normal wages that I'm paying? It is 10 hours into 100. 10 hours into 100 is going to be my normal wages. Sir, why, sir? Look, those 2 hours he worked beyond office hours, no? Whether he worked beyond office hours or not, whichever hour he works, definitely 100 rupees I need to pay. That goes without saying. Guys, correct? Because he worked during after the office time, how much I paid extra? I only paid extra of 50 rupees. That 50 rupees treatment alone we are talking about here. Hence, the normal wages is total hours into normal rate. Guys, clear? And what is the overtime premium? It is that extra hours into that extra amount of 50. 2 into 50, 100 rupees. Is that clear, guys? So always understand, we are talking about treatment of overtime premium, not overtime wages. Is that clear, guys? Yes. Now, here out of this 1100, 1000 rupees is always treated as direct wages. Now this 100 rupees, what is the treatment for that? Should I treat it as direct wages, or should I treat it as production overheads, or should I take it to my costing period? What is going to be the treatment? We need to see. Is this clear, guys? Are you all able to understand this? So here we're talking about the treatment of overtime premium, not the treatment of overtime wages. Is that clear, everyone? Now, that is clear. Now let's move on to the next one. Okay, sir, fine. Now, how do you treat overtime premium, sir? What is the manner of treatment of overtime premium? There is no single treatment. Now, the treatment of overtime premium depends on the reason why you are making your workers work overtime. Is that clear? Now, there are 4 possible scenarios why you can make your workers work overtime. What are the 4 possible scenarios? Scenario number 1, overtime is a regular feature. That is, it is generally a company's policy. Second reason, overtime due to customer specific request. Third one, seasonal demand. Fourth one, abnormal reason. Sir, can you explain? Yes. Overtime is a regular feature. What is this? Let us say the company is a conjuice company. Right? Now, let us say for the workload which the company has, ideally they should have hired 100 workers. But what did the company do? They didn't want to hire 100 workers and pay wages and all. They hired only 70 workers. Now, for a work which requires the presence of 100 wages, if you want to get the same work done using just 70 workers, obviously each of these 70 workers, you will have to make them work overtime every day. Right? So Saturday, Sunday, all days are Monday only for them. Every day you will make them work, guys, correct? Before office, after office, if possible, you will also give them accommodation, stay here only. Guys, now, in this case, you tell me, is it really an overtime? No, had you employed 100 workers, you would not have entered into the situation at all. Now, you wanted to save the cost of extra 30 workers. 30 workers, full cost itself you're saving. For that, for each of these 70 workers, extra little amount you pay. That is overtime premium. Now, ideally speaking, this is not a case of overtime at all. It is because of your company's staffing policy that you are making them work overtime. This is not treated as overtime. I will treat it only as direct wages. Are you all able to understand this? Substance over form. Is that clear? You call it overtime, but ideally it's not overtime. You are saving some money. That's why you are making them work overtime. Hence, in this case, it will be treated as a part of prime cost. That is direct wages. Is that clear? Next one. Overtime is due to customer's specific request. Now, what is this? Now, let us say, guys, a particular job, right? Let us say it takes, example, it takes 6 hours to complete a job. Okay. Now, let me give you an example which you guys might relate. Income tax filing. Okay. Let us say you are an article, right? You have to do income tax filing. Okay, guys. Now, in this case, what happens? Let us say for a particular return, it takes 6 hours to file this ITR. Okay. Now, what happens? Your office time is generally 9 a.m. to 6 p.m. Okay. 9 a.m. to 6 p.m. Now, this particular work takes how many hours? 6 hours. One particular client's income tax return takes 6 hours. Okay. Now, what you did, you started this work at 3 p.m. Okay. Now, 3 p.m. to 6 p.m. today, how many hours have gone? 3 hours. Now, this job will take how many hours? 6 hours. So, 3 more hours are required. What you said? Sir, tomorrow I will come and you do. Your boss also said, okay. You packed your bag, and when you're about to leave, the client came inside and he said, sir, I want the ITR today itself, sir. Please file it today itself. Then your boss said, if I make him work overtime, then it will cost extra. The client is saying, customer is saying, sir, don't worry, I will pay you. Whatever is extra, I will pay you. Now, what you did, instead of completing this work tomorrow morning, your boss, his favorite job, asked you to work today itself. He asked you to stretch after the office hour. Sir, instead of 6 p.m., work for 3 more hours. What? Till 9 p.m. you work. Are you able to understand this? Now, the same work would have been done tomorrow. But the customer asked you to do it today. And for each of these overtime hours, in our example, in this case, now there was an extra premium of 100 overall. Guys, correct? Now this the customer is willing to bear. If that is the case, now what will you do? You will treat it as a direct wages, but remember, of that particular job alone, you will treat it as a direct wages. Is that clear? Why? The customer is willing to bear it. Are you all able to understand this? Next one. Suppose overtime is due to seasonal demand. What is this, sir? Example. Let us say we are talking about a sweet manufacturing company, laddu manufacturing company, right? During the month of Diwali or before the month of Diwali, right? Why Diwali? Elections. You have elections this year, right? 2026 elections, right? Now, obviously, the sweet shop, these guys will they will get one contract from all the parties, right? One party will win, but all the party contract they will get, correct? Right? So anyway, someone has to celebrate. Now there will be one winner at least. Whoever is the winner, it doesn't matter for me. I will only make laddus and give it to them, guys. Correct? Now during this season, peak season, heavy demand is there, guys. Correct? Now because of that heavy demand, every year once it will be there, right? Maybe because of Diwali or something like that. 1 or 2 months there will be heavy demand. Now because of that, I make my workers work overtime. Now this is not a regular feature. This is also not due to one customer's request. This is my general nature of business. So I will treat it very much as a product cost only. But this is seasonal in nature. I will treat it as an indirect manufacturing cost, and I will treat this overtime premium as a production overheads. Is that clear, guys? Are you all able to understand? Reason, it is related to my business, but not directly specified to one particular job or unit. Is that clear, guys? Hence, I will take it as POH. Next one, overtime is due to abnormal reason. For example, after COVID, the staffs were asked to work extreme overtime. Now, because of that abnormal reason, rarely it happens. In that case, now take it to costing P&L, treat it fully as period cost. Is that clear, guys? So how many reasons are there? 4 reasons. Reason number 1, company policy, conjuice, right? Treat it as a direct wages of all the jobs. We will see the treatment. Number 2, customer specific request, take it as direct wages of that particular job. Next one, seasonal demand, POH, abnormal reasons, costing P&L. Is that clear? Now I'll give you an example. Mr. X, he works for a total of 120 hours, breakup. Normal hours, 100 at the rate of 10. Overtime wages is 20 hours at the rate of 15. Overall, 100 into 10, 1000. 20 into 15, 300. Total amount, 1300 they pay. Job A, 70 hours. This job A includes 20 hours of overtime. Guys, job B, 50 hours, all normal time. 70 plus 50, total how much is it? 120. That is the total number of hours he has worked. So which means the entire overtime is worked on job A. Is that clear, guys? Is that clear? Now, scenario number 1. If overtime is a regular feature, now what happens? Guys, overtime is a regular feature. Now every day I'm going to work overtime. Guys, correct? Maybe this particular day, I started in the morning with job B. I finished it during my office hours. Then job A, 20 hours alone, I worked in overtime. Now this was coincidental. Maybe in this day I started with job A. Overtime hours I would have worked on job B. Or in other words, this is not job specific. This is because of the company policy. They have made me work like that. Are you clear with this? In this case, what will I do? Simple. What is the total labor cost? 1300 divided by all the total hours. 120 hours. So I get 10.83 rupees per hour. This is the effective wage cost per hour, right? Job A I spent 70 hours. Job B I spent 50 hours. Multiply that respectively with the average labor cost, and you will arrive at wage cost job wise. Is that clear, guys? So you take the total wages divided by the total labor hours, arrive at the labor cost per hour, and evenly charge it to all the jobs. So here, though this 20 hours was worked exclusively on job A, now it is not job specific, right? It was because of the company policy I made to work. Maybe in the morning I started job B, I finished entirely during my normal time. So the overtime was used on job A. Anyways, overtime I will work. Maybe had I started job A in the morning, job B I would have worked overtime. That's all. Are you clear with this? Hence, both the jobs were equally likely to be subject to my overtime. Hence, it is not job specific. Average everything and charge it evenly to all the jobs. Is that clear, guys? In this way, what happened? So, job A's wage cost was 758. Job B's wage cost was 542. Overall, 1300 rupees entirely treated as a prime cost. Is that clear, guys? Now, scenario number 2, what happens? Overtime is due to customer specific request. Now, in this case, am I a conjuice company? No. Overtime generally is not required, sir. Sorry, every hour I generally pay only 10 rupees, right? But suddenly on one job alone, right, that is job A alone, they asked me to work overtime, but the customer was willing to bear that, right? In this case, what will I do? Very simple. So now this overtime premium, how much is the overtime premium? 20 into 5. Am I right? So 20 into 5 is 100. This 100 rupees has to be borne only by job A. Why this is job specific now? Are you all able to understand? Right? How will it be? Simple. So what will you do here? 70 into 10. Guys, entire 70 hours into 10. Plus on this 20 extra I paid how much? 5. Is this clear, guys? So 70 into 10 plus 20 into 5, it comes out to 700 plus 100. 800 rupees will be the labor cost charged to job A. Job B, 50 hours, everything normal time into 10, 500. So it's going to be 1300. So here also entire amount is treated as prime cost, that is direct wages. But look at the composition, 800, 500. Whereas the previous situation, 758 and 542. If you notice the difference, here the entire job A, right, the entire overtime premium was entering into job A. Whereas in this case, the overtime premium was properly apportioned between A and B. That's why B had a cost of 542. Whereas normal time, if I take, it's only 500. Are you clear with this? Now you guys are able to understand the logic here. Ultimately, both the amount, in both the cases, entire amount was treated as a direct wage, but job-wise apportionment was different. Is that clear? This is a very, very important thing to understand. Next one. Sir, overtime is a seasonal demand, sir. Overtime is due to seasonal demand. In this case, what will you do? Sir, this overtime premium is not job specific. What will I do in this case? Simple. 20 into 5, 100 rupees of premium. I will take it to what? Production overheads account, which means every hour I will charge it only with 10 rupees. Guys, correct? Right? No. Though this 20 hours of overtime was worked on job A, once again, it is not job specific. It is season specific, guys. Correct? This season is very, very hectic. Coincidentally, today in the evening, I worked on job A. Because morning I started with job B, evening time I spent on job A. Had I started the morning with job A, right, I would have spent the evening time, overtime on job B. So in this case also, both the jobs were equally likely to have been worked on this overtime, guys. Correct? So this is not job specific. Is everyone able to understand this? Hence, in this case, what will you do? So this 20 into 5, take it out, 100. Treat it as production overheads. Now, for each of the jobs valued at the rate of 10, so 70 into 10, 700, 50 into 10, 500, that alone will be treated as what? So 70 into 10, 700, 50 into 10, 500, 1200 rupees will only enter into your prime cost component, basically direct wages. So the balance overtime premium, 100 rupees should be taken to POH account. Is that clear? And in the last situation, overtime is due to abnormal reasons. Exactly same as scenario number 3, only one difference. Instead of taking this 100 rupees to POH account, take this 100 to costing P&L. Everything else is the same. Are you all able to understand? That's about the concept of overtime premium. A very, very, very important discussion, guys. Generally, many students tend to mug this up. Please understand the logic why you're doing, and that's about this particular segment of overtime premium. Is that clear, guys? Right? Remember, we're talking about the discussion of overtime premium, not overtime wages. Right, guys? So with this, the third concept called overtime premium is also over. Now, let's move on to the last concept of discussion, which is called as labor turnover. Now, guys, labor turnover. Now, what do you mean by labor turnover? Labor turnover refers to the rate of change in the workforce. So what do you mean by this? I have a company. Now, every month, some people will come in, new people will come in, existing people will go out. Next month, some more new people will come in, some more existing people will go out. Guys, correct? So there is a poem, for men may come and men may go, I go on forever. Right? Alfred Lord Tennyson, in his poem called The Brook, he says this, very famous. Now, similarly, the company goes on forever. Correct? Right? For men may come and men may go, the company keeps on going forever. Now, this labor turnover, this is one, we will be seeing about 3 ratios, labor turnover ratios. It captures the rate of change in the workforce. Is that clear, guys? Are you all able to understand this? Are you all able to understand this? Yes. Now, in this labor turnover segment, now for your examination purpose, now there are two types of questions which you can expect. One type of question is about calculating labor turnover ratios. The other type of question is regarding calculation of profit foregone because of labor turnover. Now guys, labor turnover, you guys tell me, now when I am recruiting a new person, right, now obviously there will be recruitment related cost. I will have to find the right talent, right, and I need to hire him and I need to train him, and of course during the course of his employment I need to make sure that he works properly and all that. Training is very much required. Is correct. Now suppose an employee comes, he gets trained, 3 months he stays and he leaves. Now you tell me, once again I need to find another employee, train him and do all these things. Basically if the labor turnover is high, now it results in huge amount of cost for the company. Guys, correct? Now because of a high labor turnover, what is the impact of profit is what we will be computing in the next second segment of, the second type of problems in this area called as labor turnover. Is that clear, guys? Are you all able to understand this? Yes. Now, high labor turnover represents frequent entry and exit of employees. Is that good? Definitely not. It is bad. Then, sir, low labor turnover, is that good? That is also bad. Why? It means there is no movement of employees, which means when a person joins, it is like on government job. He will stay there forever, right? Till 60, 65. So he will also stay along with the company. He will also keep saying this, I will also go on forever. Now, old talent, you will not get fresh blood. Young talent you will not get. You will be exposed to old talent only. Now, when he joined, maybe Indira Gandhi was a prime minister. So at that point he would have joined. So he would have been used to writing letters and all, right? Instead of using systems, computers, message and all. So if he still continues and he says, no sir, accounting I will put only debit, credit, no system, obviously the company cannot go on forever. So what happens in this case? Now you are not attracting fresh talent. Guys, correct? So remember, a high labor turnover represents a frequent entry and exit of workforce, which is bad. And a low labor turnover represents what? A very rare movement of workforce, which is also bad. There has to be a balance. Is that clear? Is that clear, guys? Fine. Any problem, any issues here? Now, quickly, let's have a look at the different labor turnover ratios available. Different labor turnover ratios available. Now, one second. Labor turnover ratios. Yes. Now, labor turnover ratios. There are three popular methods in which you can compute the labor turnover ratio. One is called the replacement method. Then you have a method called separation method. Then you have a method called the flux method. Replacement method. How will you compute your labor turnover? Very simple. Number of replacements divided by average number of workers into 100. Separation method. Number of separations divided by average number of workers into 100. Now first, what do you mean by average number of workers? Opening number of workers plus closing number of workers divided by 2 is called as average number of workers. Is that clear? In a month, let us say opening workers were 120, closing workers were 80. What is the average workers? 180 plus 80 by 2, which is 100. Am I right, guys? Are you all able to understand? Fine. Now, replacement method, separation method, the first two methods. First, we will see what do you mean by separation. Simple, guys. Separation means the total number of people who have moved out of my company. I have a company. The total number of people who have moved out in this particular period, right? It could be a month or a year, whatever it is. Let us say a total of 50 people in this month moved out of my company. Sir, why, sir? There could be so many reasons. One, retirement, or I actually forced them to resign. I threw them out, or death. There could be so many reasons why people move out. They are saying, so under the separation method, how do you compute the labor turnover? Turnover does not sales, guys. So here what will you do? Total number of people who have moved out, separations, divided by average into 100. Very simple, no? Yes. Next, replacement method. Now replacement method, how will you compute? Simple. Total number of replacements divided by average number of workers into 100. Sir, what do you mean by replacement? I will tell you. I will tell you. Now, guys, let us say this month totally 5 people moved out of my company. 5 people moved out of my company, right? Now, let us say I hired 8 new people. How many people moved out? Everyone? 5. But I hired how many people? 8 people. Sir, why did you hire 8? I will tell you. Out of these 8 people, 4 people took the positions which these people vacated. That is, 5 people moved out of the company. Now, out of these 5 existing job vacations, the newcomers, 4 newcomers took the positions. Is that clear? Or in other words, 4 people replaced my existing workforce. Is that clear? So then what happened to this one? I thought this one position is not even required. I don't know why I had this guy. That's why I only sent him out. Is that clear? So in this case, the number of replacement is how much? 4. Are you all able to understand? Replacement means what? The number of people that I've hired who will replace the existing people who went out. Are you all able to understand? Sir, but you hired 8 people, no? Out of that 4 are only replacements. Who are the balance 4? Now these 4, now I hired them because I am having an expansion program. I created 4 new job positions. Is that clear, guys? Are you all able to understand? Hence, in this case, under replacement method, I will not take 8. I will only take 4 as the number of replacement. So, replacement method, what is the formula? Number of replacements divided by average number of workforce into 100. Is that clear? Separation method, number of separations divided by average number of workers into 100. Is that clear, guys? Now, understand one thing. In this case, I hired 8 people new. 4 people were replacements. 4 people were new joinees. Is correct? Are you understanding? Sum total of your replacements and new joinees, or in other words, it's going to be 8 people. This is called as accessions. Accessions means what? The total number of additions made. Is that clear, guys? That's called as accessions. Are you all able to understand? Now, let's go on to the third method. The third method is called as flux method. What is it called as? Flux method. Now, what it says? Very simple. Flux method says total number of separations means what? People who have moved out plus total number of accessions means what? Replacements plus new joinees. Or in other words, simple. Separation, exit, accessions, entry, total exit plus total entry divided by average number of workers into 100. Is that clear? Very simple to remember, guys. Correct. So flux method captures both the entry and the exit. Separation method captures only the exit. Replacement method captures only the entry of those people who exited. Is that clear? Not the total entry also. Is this clear, guys? Are you all able to understand? That's all, guys. Now, with these 3 methods, sir, so I get some percentage ratio, no? So, what is the meaning of that? It has no meaning by itself. So, you compute your company's ratio, compare that with your industry's ratio. So, generally in this industry, this much is allowed. Now, compare your ratio with the industry ratio and see whether your employee turnover is more or less or more or less the same. Is that clear, guys? For that purpose only, we do this employee turnover ratio calculation. Is this clear? Guys, are you all able to understand this? Right? And that's about this particular segment called as employee turnover ratios. Is that clear, guys? Now I put a doubt buster here. The accessions represents the total number of workers joined, including the replacements. Is this clear? Fine, guys. That's about this particular segment called as labor turnover ratio. Now let's move on to the second part of this labor turnover ratio, which is profit foregone. Now this has some marginal costing related concept. We've already revised marginal costing. So now let's get started here. Now profit foregone, because of the change in the workforce. Now what is the impact on my profitability? We will be seeing it here. So please take, I think it's question number, one second. I think it's question number 14, if I'm not wrong. 14, huh? Yes, question number 14. Now, guys, a very important question. Now, the management of BR Limited is worried about their increasing employee turnover in the factory, and before analyzing the causes and taking remedial steps, it wants you to have an idea of the profit foregone as a result of employee turnover last year. Now, what are they saying? Last year, The sales amounted to 83 lakh 3,300. The PV ratio was 20%, which means how much is the contribution? So 83 lakh 3,300 into 0.2. How much is that? Yes, it's going to be how much? So the contribution made was 16 lakh 60,660 rupees. Correct? Yes, in the previous period. Right. Now, what are they saying? The actual number of hours worked by the direct employee force was 4.45 lakh hours. Means what? In the last year, the total number of actual hours worked was how much? 4,45,000 hours. The actual direct employee hours included 30 hours attributable to training new recruits, out of which half of the hours were unproductive. Now, what are they saying? Now, in the last year, the actual direct labor hours were how much? 30,000 hours. Now, out of this 30,000 hours, 50% of the time were unproductive. Means what? They actually worked for 30,000 hours. Since I was training them, they were slow. They obviously initially they will be very slow, right? So ideally 50% of the time was unproductive, which means whatever they took, whatever time they took, that is 30,000 hours, ideally speaking, the job could have been done in 15,000 hours, which means the balance 15,000 hours were actually unproductive. Is that clear, guys? Is that clear? Which means this 4,45,000 hours included 15,000 unproductive hours. Am I right, guys? Which means in the last year, effective productive hours were how much? Just 4,30,000 hours. Is that clear? By spending 4,30,000 hours, they were able to generate a contribution of 16,60,660. Am I right, guys? Fine. Have this in your mind. Next. As a result of the delays by the personnel department in filling the vacancies due to employee turnover, 1 lakh potentially productive hours, excluding the unproductive training hours, were lost. What are they saying? Now, whenever an employee went out of my company, immediately my HR team should have hired someone new. Had I hired someone new, then I would have put them to work immediately. Now, but these guys, what they did, there were some delays in filling the vacancy. Because of that, I lost 1 lakh potentially productive hours. Means what? This 1 lakh is not included here. This 1 lakh was never worked at all. Had they properly and hired them timely, what would have happened? I would have got 1 lakh hours more. But I didn't get these 1 lakh hours because of this delay in recruitment and all. So literally because of the delay in recruitment, I've lost 1 lakh potentially productive hours, guys. Correct? Had I employed this, maybe for every hour I'm making them work, I would have generated some contribution. Am I right, guys? Now, the costs incurred consequent on employee turnover revealed on analysis the following. Over and above all these things. Now, for whoever is exiting, I need to pay them settlement cost. Then fresh people, recruitment, selection cost, training cost, which means all these 4 are extra costs that I will incur because of employee turnover. Assuming the potential production lost as a consequence of employee turnover could have been sold at prevailing prices, find the profit forgone last year on account of employee turnover. Now, what should you do? Simple. Last year, they were able to generate a contribution of how much? 16,60,660 by effectively spending how many productive hours? 445,000 minus 15,000, that is 30,000 out of 0.5. 30,000 is 0.5. It's 15,000 hours. 4,45,000 minus 15,000 gives you 4,30,000, which means for every hour spent, what is the contribution they can generate? 16,60,660 divided by 4,30,000. How much is that? For every hour they make their workers work productively, they will be able to generate a contribution of how much? 3.862. But because of all this labor turnover related issue, what is the total number of hours they lost? One is this 1 lakh plus out of this 30,000 also 50% was lost. So 15,000 hours were lost. Overall, how many hours were lost? 1,15,000 hours are lost. Had there not been this labor turnover, I could have saved this 1,15,000 hours, and on each hour I would have generated a contribution of 3.862. So 3.862 into 1,15,000 gives me how much, guys? So I could have generated a profit, extra profit of or contribution of 4,44,130. Is that clear, guys? So this is the total contribution foregone. Guys, correct? not the total profit foregone. This is the total contribution foregone. Guys, correct? And on top of that, I am also incurring these 4 expenses. Add up all these things, you will get the total profit foregone. Is this clear, guys? So 443,130 is the contribution foregone. On top of this, add all the extra costs that you spend, add it up. This is the total amount of profit foregone. Is this clear, guys? It comes out to 5,57,930. I'm not getting into the calculation, but this is what it is. Are you all able to understand? Isn't this simple, guys? Isn't this simple? So what you need to do, arrive at the contribution per effective productive hour, right, and multiply that with what the total productive hours lost. So you will arrive at the total contribution loss. On top of that, add all the extra costs that you will incur. So you will get what? The total amount of profit foregone. Is this clear, guys? Are you all able to understand? And that's about this particular area of your employee turnover. And in fact, that's about this particular chapter also. And one more thing, guys. Then you have this one, direct expense. Nothing great. We have already done this. We have already done this in in our cost sheet area, right? Direct expenses. This is nothing but expenses other than direct material and direct labor, which can be directly traced, right, per unit. Now examples we've seen: royalty, higher charges for specific equipment, then product specific design drawing, product specific software, even your job charges. You've seen those sums as well, right? All those things will come under direct expenses. That's about it, guys. Nothing beyond this. They just wanted to keep one more area on the face of your syllabus. That's the reason why ICAI has done this. As simple as that. Is that clear, guys? Fine. With this, we have completely covered and revised this particular chapter of employee costs and direct expenses. Fine. So now let's get started with the revision of yet another important chapter called material cost. Now guys, generally from this chapter, around 5 to 10 marks gets tested in your exam. And once again, this particular chapter is a common chapter for CA and CMA inter students. Now guys, this particular chapter is very important, not only from an examination perspective, but also from a real life perspective. Hence, now quickly, we will revise this entire chapter, right, in a proper manner. Now guys, if you see, in this chapter, you have multiple concepts, right? Components of material cost, economic order quantity, EOQ with price discount, stock levels, issues valuation, stock out cost, ABC analysis, inventory turnover ratio, treatment of losses. These are all the list of concepts covered in this particular chapter material, right? Now, our subject as a whole has 3 objectives. One is stock valuation profit computation. Then you have decision making, and then you have control. The reason why we study this subject, cost and management accounting, is because it goes on to achieve 3 objectives. Now, this chapter fits into which objective? Now, there are some concepts in this chapter which go on to achieve the first objective. There are some concepts which go on to achieve the second objective, and there are some concepts which go on to achieve the third objective. For example, the components of material cost, treatment of losses, issues valuation, all these things come under the first category, that is stock valuation profit computation. Whereas for the purpose of decision making, you can take EOQ. That's for the purpose of decision making. Even stock levels, all these things come under the category of control. Even EOQ, you can say, it achieves both your decision making and control perspective. Clear with this, guys? So which means this chapter has so many concepts. Some of the concepts go on to achieve objective A, some of the concepts go on to achieve objective B, and some other concepts go on to achieve objective number C. Is that clear, guys? Yes. Now with this context, now let's go and do the first learning objective, which is components of material cost. Now, when I say material cost, right, in my cost sheet, this is the first line item. Am I right, guys? What forms part of material cost? Simple. Now, whatever cost you incur to bring your raw material from the supplier's location to your location include all the costs. Is that clear? This includes the amount you pay to the supplier, purchase cost. This includes freight inwards, transportation cost. All these things you can add it up. Is that clear, guys? Now, treatment of some special items. If they are giving a trade discount, you can subtract it. Quantity discount, subtract it. Suppose cash discount is given, no, this should be ignored. Why? We saw this earlier in cost sheet. Cash discount is in the nature of finance cost, should be ignored. Any subsidies or grants or incentives, so any benefit that I get should go on to reduce my material cost. Any duties and taxes, right? Road tax, toll tax and all, yes, these are the costs I incur to bring my material to my present location, yes, add it up. GST should be added only if ITC is not allowed. If GST should be added only if ITC is not allowed. If ITC is allowed, then it is ideally not a cost, hence it should be excluded. Is that clear, guys? Right? Next, customs duty. Yes, customs duty should be added because there is no credit on customs duty. Any kind of penalty and charges. One popular adjustment is demurrage. What do you mean by demurrage? Demurrage is basically a penalty which the transporter will charge his customer. Let us say I am arranging a transport facility. For some reason, documents are missing. So that GST officer, what he did, he stopped my vehicle for 3 days and then he left it. Now what happens? For this transporter, there is a huge loss, right? Now the transporter will ask me to pay something called as a demurrage. Is that clear? So if the government charges, it is called as fines, penalties and all. Other people, if they charge, it's called as a demurrage. Is that clear? Now, any kind of abnormal expenditure like demurrage, detention charges, fines, penalties and all, they are abnormal in nature, should not form part of your material cost. Take it separately to costing P&L. Is that clear, guys? Yes. Any other expenditure. Insurance, freight insurance, right? So for the freight, during the freight insurance, yes, added to the cost. Commission brokerage paid for identifying the supplier, added to the cost. Freight inwards, added to the cost. Cost of containers, what will you do? Now, if they are non-returnable nature, the supplier says, look, you need to pay for the container, that's all non-returnable, then in that case, container cost, I should add it. It's a cost I incur. Suppose they are returnable containers, right? In that case, he's saying maybe you pay a deposit. This is like your water can. You pay a deposit. Once you return back the containers, I will refund the amount to you. This is not a cost only. Just an advance you pay and you get back. In that case, it should not form part of cost. Let us say he took an advance of 100 rupees, but when I returned back the containers, he repaid only 80. In this case, the net amount of 20 should be treated as a container cost, should be added to your raw material cost. Is that clear, guys? These are all the different types of adjustments you can see in this area. Is that clear, guys? So technically, what forms part of material cost? All the costs which are incurred to bring my raw material from my supplier's location to my own factory, to my present location. Is that clear, guys? Remember, most importantly, any kind of abnormality should be excluded. GST, if ITC is allowed, should be excluded. And one very important thing, cash discount should be excluded. Are you all able to understand? These are all the catches here. That's why I have kept it here in our concept decoder book. Is that clear, guys? Right? Now, let's move on to the next concept called as economic order quantity. Economic order quantity. Now, what do you mean by this concept of economic order quantity? Now, guys, let us say in a year, I need to purchase a total of 1,20,000 kgs of raw material. I have two options. What is 1,20,000? The annual consumption requirement of raw material. Let us say I have two options. Option number one, place a single order, right? Buy the entire 1,20,000 kgs. Or option number two, no sir, not a single order. 12 times I will order, which means per order I will order only for 10,000 kgs. I'll buy 10,000 kgs. Once it gets over, another 10,000 kgs. Like that, 12 times I will order. Now, in both the cases, 1 into 1,20,000 is 1,20,000. 12 into 10,000, this is also 1,20,000. In this case, annual consumption will not change, but the manner in which I buy it, that alone changes. Is that clear, guys? Now, between the two alternatives, which one is better? Now, you can't come to a conclusion directly because each of these alternatives will have one advantage and one disadvantage. Sir, what are you talking about? How can there be one advantage, one disadvantage? Now, for the purpose of this segment, economic order quantity, now overall raw material cost is bifurcated into three. One is your purchase cost. Then you have something called as ordering cost, and then you have something called as carrying cost. What do you mean by ordering cost? Ordering cost means the cost that you incur whenever you place an order. which means the cost driver here, we have seen in activity based costing, the cost driver here is number of orders. It is not number of units. Every time I place an order, I will incur this cost. Sir, example, sir. Now large companies, before they place an order, bulk orders they will place, right? They will first make a newspaper advertisements. Now they will invite suppliers to give quotations. Now once for that newspaper advertisement is required, cost you incur, no? Number one. Number two, upon receiving the quotes, they will have a team and they will have to select the best supplier, the vendor. Now once the supplier is selected, they will place an order. It gets transported to my location, guys. So transportation cost is every time I place an order only I incur, guys, correct? And once I receive it, I need to break it will be in bulk, right? I need to break the bulk and properly I should store it in my stores area. Is that clear, guys? Now all these process involves costs, and these costs are linked to the number of orders. Every time I place an order, only then I will incur these costs. Is that clear, guys? Now on the other hand, I have something called as carrying cost. What do you mean by carrying cost? Carrying cost also refers to storage cost, right? Now basically your warehouse rent, warehouse keeper salary, the insurance on the stock which you are holding with you. Are you all able to understand, right? Opportunity cost, it also comes here, right? Opportunity cost means what? Sir, when you and I go to a go down, let's say there are 50,000 units of a particular raw material. We will say there are 50,000 units of raw material, but when a supplier, when the businessman comes and sees, he'll say, sir, I have 5 lakh rupees worth of stock, sir, because every unit costs me 10 rupees, let us say. So he will say, I have 5 lakh rupees worth of stock. Now I have blocked 5 lakh rupees of my funds in this stock. Now, had I not blocked it here, maybe I would have put it in an FD and I would have generated some interest. Because I've purchased this particular stock right now, I'm losing out on that interest, guys. Correct? That is an opportunity cost of carrying or holding this inventory. Is that clear, guys? So always remember, for the purpose of EOQ discussion, what happens? Stock is classified into 3. The purchase cost, which you pay to the supplier, ordering cost, and carrying cost. Now, guys, I gave you 2 scenarios here, option 1, option 2. In both the scenarios, I end up purchasing the same 1,20,000 kgs. Guys, correct? So because of this decision, that is what decision? Order quantity. Per order, should I place an order for 1,20,000 or should I place an order for 10,000 kgs 10 times, 12 times? Are you clear with this? Now, because of this order quantity decision, does my total consumption change? No. When my total consumption is not changing, right, obviously my purchase cost will also not change. Am I right, guys? Because whether you place an order for 1,20,000 kgs as a whole in a single order or 10,000 kgs per order, he does not give you any discount. Guys, clear with this? Hence, in this case, your purchase cost is not affected by your order quantity decision. Am I right, guys? So now what gets impacted is only your ordering cost and carrying cost. How, sir? Now, if I increase the order quantity, you look at this. In this case, per order, I increase the order quantity. Now, what happens to the number of orders? The number of times I need to order is going to be less, which means the ordering cost will reduce. Guys, correct? But on the quantity, what will happen? Since I have 1,20,000 kgs with me, I'm purchasing. Now, the quantity of stock that I hold, the average inventory size will be more. Guys, correct? Hence, because of this, what will happen? Your carrying cost, that is the cost of holding your inventory, will increase. Is that clear? So here the advantage is by way of low ordering cost, but disadvantage is by way of high carrying cost. Suppose if I reduce my order quantity, what will happen? The number of orders will increase. Correct? Now, because of this, the total ordering cost will go up. Guys, correct? But what happens? Sir, at a time I still hold only maximum of 10,000 kgs. So average inventory is coming down. Because of this, my carrying cost will come down as a whole. Guys, are you all able to understand? Hence, now if I have a more order quantity, example, scenario 1, advantage is by way of lower ordering costs. Whereas if I reduce my order quantity, the advantage is by way of a lower carrying cost. Now, which will give you, which alternative is better? Sorry, which alternative is going to be better for you? Now, you can't come to a conclusion directly. This is where they are saying the economic order quantity means what? The best order quantity is going to be root of 2 into A into O divided by C, where A stands for annual consumption, O stands for ordering cost per order, and C stands for carrying cost per unit per annum. Remember, carrying cost is driven by two things, per unit, per annum. Is that clear? Per unit, basically this talks about your quantity, and per annum this talks about your duration. Whenever I'm saying, sir, the carrying cost is going to be 3 rupees, I will say, sir, it costs me 3 rupees to hold 1 unit for 1 year. Is that clear? So this cost is driven by two things. One is your quantity, the other one is your duration. That's why it has to be mentioned with two cost objects, per unit, per annum. Is that clear, everyone? Guys, are you all able to understand this? So now, this is what the formula says. Now, sir, how does this formula arise? Simple. They use the law of economics here. Let us say on the x-axis I have rupees, and on the x-axis I have order quantity, and on the y-axis I have rupees. Now, guys, if I keep on increasing my order quantity, what happens? The number of orders will fall down, guys, correct? And my ordering cost will be less, guys, correct? So the ordering cost curve will look like this. As you increase the order quantity, the ordering cost will reduce, guys, correct? Whereas, if I keep on increasing my order quantity, average inventory will increase, hence carrying cost will also increase, guys, correct? Now, by using law of economics, we say that the best optimum quantity, the economic order quantity, will be at a point when your ordering cost is equal to your carrying cost. Is that clear? Why? This is what you would have studied in your economics also. Your optimum production level is at a point when marginal cost is equal to marginal revenue. Guys have studied that? Yes, similar, the same concept here they are using. At this point, which is the best economic order quantity, it happens at a point when your ordering cost is equal to your carrying cost. Is that clear, guys? Right? Now, at this point only, your overall cost will be kept at minimum. Right? If you deviate from economic order quantity, your overall cost will definitely be more than what you get at the EOQ level. Is that clear, guys? No. So, which means at the EOQ level, ordering cost should be equal to carrying cost. Am I right, guys? Now, ordering cost, how much is it? Can I say it is number of orders into O? What does O stand for? Ordering cost per order. Carrying cost is nothing but average inventory into carrying cost per unit per annum. Guys, average inventory means what? The inventory that I hold on an average at any given point of time. Is that clear? Now, number of orders, I can rewrite it by a formula A divided by OQ. Sir, how, sir? Now, for example, number of orders. In the first case, now, how many orders do I place? Guys, 1. How did you get this? In a year, I have to purchase 1,20,000, and in this per order, I'm purchasing 1,20,000. Divide that, you get 1. Whereas in the second scenario, in a year I need to purchase 1,20,000, but every time I place an order, for 10,000 kgs. So 1,20,000 divided by 10,000, you get 12 orders, guys. Correct? Are you all able to understand? Which means the number of orders is nothing but A divided by OQ. Am I right, guys? Into O. So if you do this, you get the total ordering cost. Am I right, guys? This should be equal to your carrying cost. What is carrying cost? Average inventory into C. So average inventory, how can you find out? This is half of order quantity. Sir, how did this formula arise? I will give you the logic here. Let us say my order quantity is 10,000 kgs. Now, what will I do? I will purchase 10,000 kgs. Now, I will keep on consuming it. Now, the moment it hits 0, once again I will purchase another 10,000 kgs, consume it. And once it hits 0, once again I will purchase another 10,000 kgs and I'll keep on be consuming it. Am I right, guys? Or in other words, at any given point of time, my maximum stock I hold is how much? 10,000. Minimum stock I hold is how much? 0. The average stock I hold is how much? 10,000 plus 0 divided by 2, which is going to be 5,000. Or in other words, it is 1 by 2 of order quantity. Guys, are you all able to understand every single logic I'm explaining in the marathon itself? Right? So, half of order quantity into C is going to be your total carrying cost. Is that clear, guys? So now, if you equate this to A by OQ into O is equal to 1 by 2 into OQ into C. If you do that, what happens? OQ, you can take it to this side, becomes OQ square. Guys, correct? And this is equal to take this to the numerator, 2AO divided by C. Is that clear, guys? So OQ square is equal to 2AO by C, or OQ is equal to, so to the power 2, if it goes to the other side, it becomes to the power 1 by 2. Guys, correct? Or in other words, So it is going to be OQ is equal to root of 2AO by C. Is that clear, guys? Right? And this is the order quantity where your total cost is the least minimum. Hence, I call it as a EOQ, economic order quantity. Is that clear, guys? This is the derivation for EOQ. Should you mug this up, guys? No. Very, very simple and straightforward. Is that clear? So now, what is the formula for EOQ? Root of 2AO by C, where A stands for annual consumption requirement, O stands for ordering cost per order, and C stands for carrying cost per unit per annum. Is that clear, guys? Right. And that's about this particular concept of EOQ. Now, shall we just go and do one sum here? So please take question number 3. Please take question number 3. Yes, please take question number 3. Shall we begin? Yes. Compute the EOQ and the total variable cost of the following. What have they mentioned? The annual demand is going to be 5,000 units. The per unit cost is going to be 20. Then ordering cost is 16 rupees per order. Then storage rate is 2%. Interest rate 12%. Obsolescence rate 6%. Now, add these three. How much you get? 2 plus 12 plus 16. 20%. Guys, this 20% represents your carrying cost. Guys, correct? Right? That is storage cost is 2%. Interest opportunity cost is 12%. Obsolescence rate. Obsolescence means the chances of it getting destroyed or not destroyed, spoiled. Is that clear? 6%. Add up all these things. This is the total carrying cost, but it is expressed as a percentage, sir. It is 20% on what? The 20% on the value of material that you hold. So what is the value of material? Guys, it's going to be 20 rupees. Is that clear? So 20% on 20, how much is that? 4 rupees. 4 rupees per unit per annum is going to be my carrying cost. Is this clear, guys? Is this clear? Now, sir, why are we applying this carrying cost as a percentage on value? Obviously, guys, because your carrying cost is dependent on the value of your product. For example, I am a diamond manufacturer. In that case, I need to have a very good and a proper sophisticated system of storage. Guys, correct? Right? I will be having, different ducts and all, and I will be having, so many lockers and all these things, and security and other things I will be having. Suppose I am a chappal manufacturer. Now, in this case, I need not actually have so much sophisticated security system and all. One small garage is enough for me. I can store it. Put one shed and a lock also, one small rod I can keep and come. No one is going to take it. Guys, correct? Are you all able to understand? Right? So no one is going to take it. If at all someone wants to steal it, they will steal only outside temples. They will not steal inside this garage. Guys, correct? No. Correct? Okay. So hence, look at this. So depending on the value of the material, your carrying cost also varies. Is that clear, guys? Hence, this 20% should be applied on what? The value of the raw material, which is 20 rupees. So it's going to be 4 rupees. What is the ordering cost, guys? Hello? What is the ordering cost? 16 rupees per order. And the annual consumption requirement is how much? 5,000 rupees. Simple. Determine the total cost that would result for the items if a new price of 12.8 is used. So first, you arrive at this 20%. 20% on 20 is going to be 4. So root of 2AO by C. A is 5,000. O is 16, C is going to be 4. Am I right? So root of 2 into 5,000 into 16 divided by 4. So it's root of 40,000. So you get 200 units. What is the meaning of this? So overall in a year, I need to purchase 5,000 units, but purchase it in lots of 200 units. Is that clear, guys? That is the meaning of this. Are you all able to understand? Is there any issue here? No. Now, if I purchase in lots of 200 units, what's going to be my total cost, guys? First, in a year, I'll purchase 5,000 units at the rate of 20. The cost is 1 lakh. Correct? Then ordering cost. How much will that be? Number of orders. 5,000 divided by 200. How many orders are there in a year? 25 orders are there in a year. Every time I place an order, it costs me how much? 16 rupees. 25 into 16. So 400 rupees is going to be the total ordering cost. Guys, and how much is going to be my carrying cost? Average inventory, that is 1 by 2 into 200. Guys, correct? Into carrying cost per unit per annum, which is 4 rupees. Am I right, guys? Right? So look at this. It's going to be how much? So 1 by 2 into 200 into 4. So this is going to be 4 into 100 is going to be 400 rupees. Is that clear, guys? So overall the cost is 1 lakh plus 400 plus 400. So 1 lakh and 800 rupees. And remember, at the EOQ level, ordering cost is equal to carrying cost. It is matching. Is that clear, guys? Right? Are you all able to understand? So we have computed the EOQ. We have also computed the total cost at the EOQ level. Is this clear for everyone? Guys, correct? Fine. Next. Now, suppose they are changing the price. Sir, price is not, currently it is 20. Price is not 20, sir. It is only 12.8 rupees. In this case, sir, how will you compute EOQ? Simple. A will continue to be 5,000. O, ordering cost per order is 16. C will change now. C will be 20% on the value, 12.8. How much is that? 2.56 rupees. It becomes 2.56 rupees. So root of 2 into A 5,000 into O 16 divided by C 2.56. How much you get? 2 into 5,000 into 16 by 2.56. Yes, 62,500. Square root of that, you get 250 units. So if the price is reduced to 12.8, now what will you do? Now it's better if you purchase it in lots of 250 units. The cost at that level, 5,000 into 12.8 gives you 64,000. Ordering cost will be number of orders, 5,000 divided by 250. So 20 orders you will be placing in a year at the rate of 16, which is going to be 320. And average inventory is half of order quantity, 250, into carrying cost per unit per annum, which is 2.56. So how much will you get? You will get 320 again. So the total cost in this case is going to be how much? 64,640. Is this clear, guys? As simple as that. Is that clear? It's as good as doing two different sums, but this is all it is, right? In our regular and exam oriented batch, we actually work it out in detail, right? In a marathon, I'm doing it as a discussion, right, guys? Fine, clear with this? Fine. Can we just go and update our library of adjustments? Write down calculation of EOQ and total cost computation. Calculation of EOQ and total cost computation, right, guys? Fine. So that's about the second segment of discussion, which is EOQ. Now let's move on the next important segment of discussion, called as stock levels. Now guys, in this concept, stock levels, now there are 5 different stock levels. One is called as reorder level. Then we have something called as minimum stock level, then maximum stock level, average stock level, and there's something called as danger level. So these are the 5 different stock levels that we have got. Now one by one we will see. Reorder level, that is the first thing we are going to see. The formula is maximum consumption per period into maximum lead time. Now before we get here, first we need to understand some terminologies. Now there is something called as lead time. It is also called as a reorder period. What is the meaning of this lead time or reorder period? Let us say today you place an order for a product on Amazon, okay, but you receive it only after 3 days. The delivery happens only after 3 days, guys, correct? Now the time gap between the date of placing an order and the date of receipt of delivery is called as a lead time. It's also known as reorder period. Is that clear, guys? Right. Now let us say I'm running a company, right, and I'm having some raw materials. Let's say 1000 kgs of raw materials are there. I keep on consuming it. Now, what happens? Suddenly, I notice that the stock balance is 0, right? Now, I take the phone call and call this supplier to supply me raw material. Now, he will tell me, sir, I will supply it. It will take 3 days. Now, what is my stock balance? 0. Now, I have already reached 0. Now, if I place an order for the next 3 days, what? I will have to stop my production, guys, correct? Now you tell me, any logical and a prudent company, will they wait for the stock balance to hit 0 to place the order, or they will be noticing the stock level before it reaches 0 itself? They will pick the phone and place an order. What will they do? before even it hits 0, they will take the phone call and place an order. Am I right, guys? Right. Now, in that case, when, sir, when will they place an order? That is, at what point of stock level should they place an order? That is the question, guys, correct? So when will they place an order is called as reorder level. For how many quantities should they place an order? That is called as EOQ, right? The question is not how many quantities you should purchase at a time. The question is when should you place an order? That is, when should the person pick the phone call and place an order? Logically, you tell me, the company knows every day exactly they will consume 100 kgs of raw material, and they know exactly this supplier will also take 3 days to supply this raw material, which means 100 into 3, how much is it? 300 kgs. Now the moment the stock balance touches 300 kgs, now this guy will pick the phone call and place an order, right? Now what will happen? This guy, as expected, will say, I will take 3 days, correct? Now what happens? In each of these 3 days, I will be consuming 100, 100, 100. Exactly when my stock balance is 0, fresh stock will come in. So I need not stop my production because there is no stock, guys, correct? So in this case, so when will you place an order? The reorder level will be what? Consumption per day into lead time, guys, correct? That is ideally your reorder level. Am I right, guys? But you are absolutely right. This is the formula we need to use when we are certain about the consumption. We are also certain about the lead time. Now, in reality, every day exactly will I consume 100 kgs? No. And in reality, every single time I place an order, exactly will deliver in 3 days? Not necessary. Now, that is why I'm giving you a range. Let us say lead time. Minimum lead time is 4 days. Maximum lead time is 6 days. Means what? Even if you want, before 4 days, you will never get the stock. And I always know this supplier, he will definitely take a minimum of 4 days, but he will not take beyond the 6 days also. Max the time he takes is only 6 days. Is that clear, guys? So the minimum lead time is what? 4 days. Maximum lead time is 6 days. Or average lead time will be 4 plus 6, 10 divided by 2, 5 days. Am I right, guys? So minimum lead time 4, maximum lead time 6, average lead time is 5. Is that clear, guys? Yes. Suppose, how about consumption? Sir, minimum consumption, every single day, 4 units of raw material will be consumed. Right? Below 4, it will never go. Maximum consumption is going to be 6. Beyond 6 also, it will not go. So I've given a range. So minimum consumption is 4 units per day. Maximum consumption is 6 units per day. Average consumption is 4 plus 6 by 2. 10 by 2 is 5 units per day. Is that clear? Now, reorder level is what? Consumption per day into lead time. Now I have 3 figures in each of the category. Sir, consumption I have minimum, average, maximum. Lead time also I have minimum, average, maximum. So now, sir, what is the figure I will have to take? Is that clear, guys? Now, this is where we are going to see the formula. The first thing that we are going to see in stock levels is a reorder level. Is that clear, guys? Now, guys, for the purpose of this example, for the purpose of this concept, we will take an example of our mothers, right? Now, in your kitchen, your mom will have a big drum to store rice, correct? Now, she has to decide when should she place an order. Again, I'm telling you, this is not for how much quantity. How much quantity is EOQ. At what point of time should she pick the phone call and place the order? Now, you tell me, will your mom ever let you sleep in a hungry stomach? No, she will never do that. Now, she will always provide for extreme case scenario only. She will always provide for extreme conservatism, prudence, guys, correct? Now, she will assume that every day the family consumes a maximum consumption. Let's say 6 kgs of rice, example, right? Every day the family will consume 6 units. And this guy, that is the supplier also, let us say he will take the maximum period of time. Guys, clear with this? So, what is the maximum consumption? 6 units. What is the maximum lead time? 6 days. 6 units into 6 days. How much is it? 36 units. The moment stock touches 36 units balance, your mom will pick the phone call and she will place an order for the fresh stock. Is that clear, guys? Are you all able to understand? And this decision is taken based on extreme prudence. She will assume the family will also consume the maximum every day, and she will assume the supplier also takes his maximum lead time. Is that clear, guys? Are you all able to understand? If at all he comes earlier, it's very good. I will be definitely having some balance. It will never run out of stock. Is that clear, guys? So that is the formula for reorder level. What is the formula, guys? It's going to be maximum consumption into maximum lead time. That's about it. Shall we move on to the next formula? Yes. Now what is the next one? Minimum level. What is the formula for minimum level? Reorder level minus average consumption into average lead time. Sir, what is it, sir? Logic. Simple. Now, reorder level 36 units. This was when she picked the phone call. Am I right? But she chose 36 units as a matter of extreme prudence, conservatism. But during this lead time, normally, what would have been consumed? Generally, I know average family consumes 5 units, and average lead time, this guy also generally takes 5 days. So 5 into 5, 25 units would have only been consumed during this lead time. So I place an order when I had a balance of 36 units minus during this lead time I would have consumed 25 units. By the time I complete this 25 units, fresh stock will come in. Guys, correct? Which means the minimum possible stock at any given point of time will be what? 36 minus 25, 11 units. Now if you see at any given point of time, even in the worst of the worst scenario, minimum she will have 11 units or 11 kgs of rice. It will never be below that. Is that clear, guys? That is the meaning of a minimum stock, right? So it's going to be reorder level minus what happens generally, that is normal average consumption into average lead time. Is that clear, everyone? Yes, this is the formula. See how simple and logical it is. You need not mug up anything. Next, maximum level means what? Now, even in the best possible scenario, what is the maximum level of stock she will hold? Beyond this, she will not hold. Are you all able to understand? Now, what is the formula for that? Reorder level minus minimum consumption into minimum lead time plus reorder quantity. Reorder quantity is nothing but ideally it should be equal to your economic order quantity. Now, sir, what is this formula? I will tell you. Now, she picked the phone call and placed an order when the stock balance was 36. That is reorder level. Am I right, guys? Now, during this lead time, what happened? Everything happened in her favor. The family also consumed the minimum consumption every day, 4 kgs only of rice every day. And this guy, the supplier also, this time he took only the minimum lead time. So in 4 days itself he delivered, guys, correct? So which means he took 4 days. Each of the 4 days, everything happened in my favor. I consumed only 4 kgs every day. 4 into 4. How many kgs have I consumed? 16. So what has happened? 36 units. This was when I placed an order. Now, during the lead time, I consumed 16 kgs. So now what is the stock balance? 20 kgs. The moment the stock balance hits 20 kgs, now what happens? That guy is ringing their door with a fresh order. Guys, correct? Let us say every time I place an order for 50 units, now on top of the balance 20 units, what he will do? He will pour this fresh 50 kgs. Guys, correct? So the balance will be whatever I have, 20 plus the new 50, I will get a 70 units balance. This is the maximum possible stock she will hold. She will not hold beyond this also, because if you hold if you hold a large quantity of rice unwantedly, then it is prone to some insects and other things. So no, she will never hold beyond requirement also. Are you all able to understand? Guys, is this clear? So what is the formula here? Simple. Reorder level minus everything happens in my favor. Minimum consumption into minimum lead time plus reorder quantity. He rings the door, he rings the bell with the fresh order. Is that clear, everybody? Is that clear, everybody? Yes, that's about your maximum level. Next, average level. Now, there are two formulas for average level. One is your arithmetical formula. What is it? Minimum plus maximum by 2. Right? Now, this is not a very good formula. This is not a very correct formula. Minimum is how much? 11. Maximum is how much? 70 by 2. So 11 plus 70 by 2 gives you 40.5 units is the average stock level. However, formula number 2 is the most logical method. What is it? It says minimum level plus 1 by 2 into reorder quantity. Reorder quantity is nothing but economic order quantity. Now, what is the formula, sir? In this case, anyways, she will hold minimum is what? 11 units. Guys, correct? At any given point of time, she will be having 11 units with her. Guys, correct? Now, whenever this guy loads and comes with a fresh stock, how much is it? 50 kgs, no? 50 units. Guys, correct? Now, what happens? 50 units, 50 units, 50 units will be consumed. The moment it hits 11, once again another 50 units will come. And this gets consumed. The moment the balance hits 11, the fresh unit will come. Guys, correct? Or in other words, always she will be having 11. What averages is only this 50 units. Guys, correct? At maximum it could be 50 or at minimum it could be 0. That is over and above 11. Hence, what should average is only your reorder quantity. Hence, the formula is what? Your minimum level 11 units plus half of reorder quantity. Is this clear, guys? Are you all able to understand? Is there any issue here? Any problem here? Guys, clear with this? That's about these two formulas. One is your normal arithmetical formula. What is that? Minimum plus maximum by 2. The other one is your logical formula. Minimum level plus 1 by 2 of reorder quantity. Is that clear? Fine. That's about this part, which is your average level. Now, there's something called as danger level. Now, danger level, the formula is average consumption into lead time for emergency purchases. Now, let us say your some guests have come home. Right, some guests have come home. Now, some special variety rice. Let's say you need some biryani rice. Guest means biryani, no? So, you need some biryani rice. Now, in this case, now you can't ask the guest to wait for so long. Guys, they are staying, let us say, for 2 days. Maximum by tomorrow, you should give them biryani, no? Guys, correct. Else, what will they do? Only they know. So, what you should do now, during this time, you are asking the supplier, look, I am in trouble. So, please deliver with in the minimum possible time. This is not a normal order. This is an emergency order. Now he says for emergency purchases, the lead time is only 1 day. Right? Are you all able to understand? And average consumption. What is the average consumption, guys? In our example, the average consumption was 5 units. Guys, correct? So 5 units into 1, it's going to be what? 5 units. Means, sir, what is the meaning of this? In this case, what is the minimum level, guys? What is the minimum level? Guys, come on, everyone tell me. Minimum level is 11 units. The stock generally will not go below 11 units. But if at all it goes below 11 units, minimum level, make sure it does not go below 5 units. That is, it does not go below danger level. Why? Suppose this is another level of security for you. Another level of, safety for you. Guys, correct? It should ideally not go below 11. If it goes below 11, make sure it doesn't go below 5. Because up to 5, suppose the balance is only 5, what you can do, you can immediately place an order. And 1 day you can manage with this 5 units. Suppose if it goes below 5, the balance, you can't even manage for 1 day. You will run out of stock. Are you all able to understand this? Right? Hence, danger level means what? Your average consumption into lead time during emergency purchases. As simple as that. Now guys, shall we tell all the formulas? Let's revise this. Come on, tell me. First, reorder level formula, everyone. Maximum consumption into maximum lead time. Your mom will never let you sleep in a hungry stomach, right? Extreme prudence. Next one, minimum level. Yes. Reorder level minus what generally happens? Average consumption to average lead time. Excellent. Then, third, maximum level. Everything happens in your favor. Reorder level minus minimum consumption into minimum lead time plus reorder quantity. As simple as that. Next, average level. Bifurcated into 2. One is your mathematics, arithmetical formula. Maximum level plus minimum level by 2. On the other hand, you have a logical formula. Minimum level plus 1 by 2 of reorder quantity. Because anyways, I have the minimum. What averages is only above the reorder, the minimum level, which is basically a reorder quantity. And finally, danger level. What is the formula, guys? Average consumption into lead time during emergency purchases. As simple as that. No need to mug up anything. Everything is fully conceptual. Is that clear, guys? Right? Now, let's go and do one numerical problem here. Please take question number 7, a very good sum. Please take question number 7. It's a very, very good sum. Okay. Mohit Enterprises manufactures a special product called Z. The following particulars were collected for the year. Monthly demand of Z is going to be 1000 units. So monthly demand for Z is going to be 1000 units. The cost of placing an order is how much? 100 rupees, which means this is ordering cost. The annual carrying cost per unit is 15. So 15 is per unit per annum. Correct? No, annual cost only they have given. Next, normal usage 50 units per week, minimum usage 25 units per week, maximum usage 75 units per week. So they have given, it is not per day, everything is per week. Guys, correct? Minimum 25, maximum 75, average is 50. Reorder period, minimum 4, maximum 6, average will be 4 plus 6 by 2, 5. Fine. From the compute from the above, reorder quantity means what? EOQ you need to compute, reorder level, minimum level, maximum level, average level, danger level you need not to. Now, how do you do this? First, for the purpose of computing reorder level stands for, in this case, your EOQ, your reorder quantity. Reorder quantity in this case stands for economic order quantity. How will you arrive at this formula? Root of 2AO by C. Now, O we have 100, C we have 15. Now, what is A? What is A? Annual consumption requirement. How much is it? How much is it? Come on, calculate and tell me now. You're looking at me. Come on, tell me. Now, guys, this is a place where many students commit a mistake. Now, they say, sir, monthly demand of Z is 1000. Rightfully, I found out it is monthly. Hence, multiply this with the 12 and make it as 12,000 units. Right? Absolutely wrong. Because, please read the question fully. Mohit Enterprises manufactures a special product called Z. Z is an FG. It is not a raw material. We are in materials chapter. Hence, we need to compute economic annual requirement, consumption requirement, which means you're talking about raw material. Hence, this is a completely irrelevant data for the given question. They have just kept it to confuse you. Now, how do we do it? Now, guys, here they have given normal usage. Generally, average usage is how much? 50 units per week. In a week, in a year, how many weeks are there? 52 weeks. So, 50 units into 52 weeks. How much is that? 15 to 52 gives you 2,600. Hence, 2,600 units is going to be my annual consumption. Is that clear, everyone? Is that clear, guys? Right? So now you can compute your EOQ. So EOQ is going to be what? Root of 2 into A, 2600 into O, 100 divided by C. How much you get? 2600 into 100 into 2 into by 50 now. Okay, square root of that. You get 186.18 something. So it's rounded off to 186. Is that clear, guys? Are you all able to understand? So 186 is going to be what? My reorder quantity. That is nothing but EOQ. Guys, correct? Next, we need to compute what? Reorder level. Reorder level is going to be maximum consumption into maximum lead time. Maximum consumption 75 units per week. Maximum lead time 6 weeks. So 75 into 6. Am I right, guys? So it's going to be how much? 75 into 6. It's going to be 450 units. Am I right, guys? Yes. Next one. What is the next one? Minimum level. Minimum level. How will you find out? Reorder level, that is 450 minus average consumption into average lead time. Average consumption 50, average lead time 5. So 15 to 5 is going to be 250. It's going to be 200. Is that clear, guys? That's about it. So that's about it. This is going to be how much? 200 units. Is that clear? Next, maximum level. Recall the formula. Everything happens in my favor. Reorder level minus minimum consumption to minimum lead time plus reorder quantity. So now clearly you will see reorder level 450 units minus minimum consumption into minimum lead time. Minimum consumption 25, minimum lead time is 4. So 25 into 4, which is 100 plus reorder quantity. Just now we found out it's going to be 186. Correct? So it's going to be 450 minus 100. 350 would have been the balance by the time that guy rings the bell. So now I get an additional 86 units here. So how much is that going to be in total? 536. Is that clear, guys? See how easy it is, provided you understand the subject conceptually. That's all it takes, guys. That's all it takes. And finally, average level, two formulas, minimum plus maximum by 2. in that case 200 plus 536 by 2, how much you get? 368. That's going to be the first formula. Second formula, minimum plus 1 by 2 of reorder quantity was my minimum level, guys. 200 plus 1 by 2 of reorder quantity, 1 by 2 of 186. It's going to be 93. So the overall is going to be 200 plus 93. It's going to be 293. Is this clear, guys? Are you all able to understand? And that's about this particular question. The catch here is with respect to identifying the fact that Z is not a raw material, it is an FG, and that should not be considered for the purpose of arriving at annual consumption. You need to use the normal usage multiplied with 52 weeks to arrive at the annual consumption requirement. Is that clear, guys? Right? Please go and update your library of adjustments. Write down. EOQ computation and stock levels. EOQ computation and stock levels, semicolon, tricky calculation of annual consumption requirement. Tricky calculation of annual consumption requirement. Now, let's move on to the next concept, which is stock out cost. Now, guys, this is not that clearly explained in our institute study material, but they have given one question regarding stock out cost. Now, guys, what is this concept of stock out cost? Basically, this concept, stock out cost, helps us to achieve the objective B, which is decision making. What do you mean by stock out cost? Now, guys, if I hold my inventory stock, now I will be incurring a carrying cost, that is the cost of carrying this inventory. Am I right, guys? Yes. Suppose if I do not hold this stock, right, that is if I do not carry the inventory with me, then what is the cost of not holding the inventory is called as stock out cost. Are you all able to understand? Sir, if I don't hold the stock, how will I incur the cost? Here, cost refers to opportunity cost. That is, let us say, if you have one unit, every unit can give you a revenue of, example, I am saying, let us say, using one unit, you can generate 10 rupees of profit, right? Now, someone walks in with a demand of 5 units, but you do not have the 5 units with you, which means you are losing a profit of how much? 5 into 10, 50 rupees. This is called as stock out cost. You need not pay this 50 rupees out of your pocket. This is nothing but the amount of profit you are unable to make because you don't hold the stock. Is that clear, guys? Right? This is called as stock out cost. Now, in this context, now let us go and do one numerical problem. This is a general problem which is one question which many students are generally, they struggle to understand this particular question. Now, quickly, let me just read out the question for you. Of course, there is some issue with the wordings as well. I will just walk you through fully. Mrs. Tyro Tubes trades in 4-wheeler tires and tubes. This is a tube company. It stocks a sufficient quantity of tires for almost every vehicle. In year end 20X1, X2, the reports of sales manager reveal that Mrs. Tyro Tubes experienced stock out tires. The stock out data is given as follows. Now, what have they given here? Stock out of tires 100, number of times of stock out 2. Stock out of tires 80, number of times 5, 50, number of times 10, 20, number of times 20, 10, number of times 30, 0, number of times 33. Mrs. Tyro Tubes loses rupees 150 per unit due to stock out and spends rupees 50 per unit on carrying out on carrying of inventory. Determine the optimum safest stock level. Now, first of all, many students don't understand what the question says. Now, guys, what is this question talking about? Simple. If you are holding one unit, right? If you are having one unit of stock, you need to incur what? You need to incur your carrying cost. Am I right, guys? What is the cost of holding every unit? 50 unit. If you do not hold this stock with you, right? And if someone walks in with a demand, now in that case, you will lose out a profit of how much? 150. The company loses 150 rupees per unit due to stock out. Means what? Someone is having a demand, but I'm not able to honor him with this demand. Are you all able to understand? So the cost of holding is 50. The cost of not holding is how much? 150. Now, if you do not hold sufficient level of inventory, you will have stock out cost. If you hold too much level of inventory, excessive inventory, you will incur excessive amount of carrying cost. Now, which means you need to balance the two and arrive at the optimum level of buffer stock, safety stock that you need to maintain at all times, guys. Correct? Now, what is the number of units of safety stock that I need to maintain so that I don't incur too much of carrying cost or too much of stock out cost? There is a balance between the two. Is this clear, guys? Are you all able to understand? Now, sir, here one dabba they have given. What is this? I will tell you. They have used some words: stock out tires, number of times of stock out. Now, it is ideally wrong usage of terminologies. What is the meaning of that? I will tell you. Someone walks in with a demand of 100 tires, 100 units. Now, how many number of customers will walk into your store with a demand of 100 units? 2 customers. Now, 80 customers can walk in with a demand of, 5 customers can walk in with a demand of 80 tires, right? So, someone walking in with a demand of, let's say, they want 80 tires, right? How many such customers are possible? 5. Someone walking in with a demand of 50 units, the number of times this particular event happens is 10. Someone walking in with a demand of 20 tires, 20 customers. Someone walking in with a demand of 10 tires, 30 times it has happened, 30 customers. Someone walking in with a demand of 0 tires, window shopping, right? Maximum 33 of the customers. Is that clear, guys? Now, what is the total number of customers that can visit my shop? 2 plus 5 plus 10 plus 20 plus 30 plus 33 comes out to 100, right? Or in other words, the probability of someone walking in with a demand of 100 tires is 2 by 100, which is 0.02. Am I right, guys? The probability of someone walking in with a demand of 80 tires is going to be what? 5 by 100, which is 0.05. The probability of someone walking in with a demand of 50 tires is 10 by 100, 0.1. The probability of someone walking in with the demand of 20 tires is going to be 20 by 100, which is 0.2. The probability of someone walking in with the demand of 10 tires is going to be 0.3. The probability of someone walking in with the demand of 0 units is going to be 0.33. Is this clear, guys? Right? So I should have some stock, right? It is dependent on people walking with how much demand. Is correct? Now, any of these customers can come to my shop. It is not certain exactly every day if people will walk with a demand of exactly 43 tires. I can't come up with this kind of relationship. They are taking a data and trying to analyze that. Is that clear, guys? So which means you know what is the demand that can happen, that can come, and the probability of the event happening. Is this clear, guys? Now, with this background, now let's go and do the sum. Now, guys, for you to do this sum, you need to have a template. Computation of stock out cost and inventory carrying cost. Now, what is it? The first column, you should have safety stock. Then you should have stock out units. Then probability, stock out cost, expected stock out cost, inventory carrying cost, and total. Don't worry, I will walk you through. Now, first, let us say I am maintaining a safety stock of 100 units. Means what? At any given point of time, if you come to my shop, I will always have 100 units. Is that clear, guys? Now, in this case, you tell me, if someone walks in with a demand of 100 units, will I be able to honor him fully? Yes. Someone walks in with a demand of 80? Obviously, yes. 50, 20, 10, 0. In all these customers, I will be able to honor any customer's demand. Am I right, guys? In this case, will I be having any stock out units? No. So my stock out units will be 0. Are you all able to understand? Is there any problem here? Hence, this probability is not there. That is, the stock out chance itself is not there. So the expected stock out cost will be 0. Are you all able to understand? Because for every unit you are running out of stock, you incur how much? 150 rupees. They have given in the question. So 0 and 150 is 0. Guys, correct? Are you all able to understand? The chances of this happening is nil. Hence, the expected stock out cost is 0. Is that clear, guys? But however, what happens to my inventory carrying cost? At any given point of time, I'm holding 100 units. Every unit you hold, you incur how much? 50 rupees as the inventory carrying cost. So 100 into 50 comes out to how much? 5,000 rupees. So the total cost you incur is what? Stock out cost plus carrying cost. 0 plus 5,000. You incur a total of 5,000. Is this clear, guys? Now, let's move on to the second scenario. Second scenario. Let's say I am maintaining a stock of 80 units. In this case, what happens? If anyone is walking to my shop with a demand up to 80 units, will I run out of stock? No. Guys, correct? I will never run out of stock if these customers walk in. Correct? Now, only if a customer walks in with a demand of 100 units, even to that customer, I will be able to supply 80 units. To the extent of 20 units, I will run out of stock. Are you all able to understand? Right? So in this case, only one scenario of stock out will be there, 20 units. And when will this stock out scenario happen? Only when someone walks in with a demand of 100 units. The chances of that happening is 0.02. So the probability you will put here is 0.02. Is that clear? No, don't take 20. Sir, here it is 20, sir. I will take 0.20. No. This 20 stock out can happen only when I maintain 80 units, but someone walks in with a demand of 100 units. So person walking in with a demand of 100 units, the chance of that happening is 0.02. This is why I said the wordings are not that clear. Ideally, this should have been demand. Is correct. This should have been number of times with that demand or number of customers. Is that clear, guys? Right? Are you all able to understand this? Yes. Now in this case, what's going to be my stock out cost? 20 units stock out. Guys, correct? And every time I'm running out of stock, I have to incur how much? 150. So 20 into 150 gives you 3,000 rupees. Now, so for sure you will incur this 3,000, huh? No. The chances of this happening is only 0.02. So 3,000 into 0.02. The expected stock out cost was only going to be 60 rupees. Are you all able to understand this? We are using the concept of probability, right? The chance of this event happening. Is that clear, guys? Right? So it's going to be how much? Expected stock out cost is 60. Now, what is the inventory carrying cost? I hold 80 units at any given point of time, and every time I hold a unit, I need to incur 50 rupees. 80 into 50 gives you 4,000 rupees. The total cost is 60 plus 4,000, 4060 if you maintain a stock of 80 units at all the times. Are you now able to understand? Now, the next scenario, I will say, okay, sir, now I want to maintain a stock of 50 units. Perfect. If you maintain a stock of 50 units, what will happen? Now, if someone is walking in with a demand up to 50 units, you will be able to honor him fully. When will you run out of stock? Only when a person walks in with a demand of 100 or 80. Is correct? If someone walks in with a demand of 100 units, to him you will be able to supply 50 units. Is correct? So, you will run out of stock to the extent of 50 units. If someone walks in with a demand of 80, you will be able to supply 50 units. You will run out of stock to the extent of 30 units. The chances of this happening is 0.02, 0.05. Is that clear, guys? So, what you will do here? 50, 30, 0.02, 0.05. Are you all able to understand this? Guys, have the clarity when you do this. Are you all able to get this? Yes. Now, what is the stock out cost here? 50 into 150. That's going to be 7,500. Then 30 into 150. How much is that? 4,500. Guys, correct? Now, for sure will I incur 7.5? For sure will I incur 4.5? No. The chances of me incurring 7,500 is only 2%, 0.02. So 0.02 into 7,500 gives you 150. Similarly, the chance of me incurring 4,500 is only 0.05. So 4,500 into 0.05 gives you 225. Now add the 2, you get an expected stock out cost of 375. We are using probability, right? Statistics here. Probability. Is that clear, guys? Are you all able to understand? Right? So this is going to be 375. Because I don't have certainty, I have to necessarily use probability. Is that clear? Now, because I hold 50 units, I have a carrying cost. 50 into 50 is going to be 2,500. So now, if I'm holding 50 units, the expected stock out cost is 375. Carrying cost is 2,500. Add the 2, you get how much? 2,875. Is this clear, guys? Now let's go to the next level. Now, sir, I want to maintain a stock of only 20 units. In this case, what happens? Everybody tell me. Up to 20 units, sir. If someone walks in with a demand of 20, 10 or 0, I will not run out of stock. Correct? I will run out of stock only if someone walks in with a demand of 100, 80 or 50. If someone walks in with a demand of 100, I will be able to supply them 20 units. So the stock out is for 80. Someone walks into the demand of 80, I will be able to supply them 20, stock out 60. Someone walks into the demand of 50, I supply them 20, stock out 30. The chance of this happening is 0.02, 0.05, 0.10. As simple as that. So 80, 60, 30, 0.02, 0.05, 0.1. Guys, clear? Now, what is the stock out cost? The respective units into 150. Guys, correct? So 150 into 80 is equal to 12,000. 60 is equal to 9,000. 30 is equal to 4,500. But these are the costs which I do not incur for sure. Multiply them with probabilities. 12,000 into 0.02 gives you 240. 9,000 into 0.05 gives you 450. 4,500 into 0.1, remove 1 0, you get 450 here. Add the 3. 450 is 900. 900 plus 240 is 1140. This is the expected stock out cost. Now, what is going to be my inventory carrying cost? 20 into 50, that's going to be 1000. Add the 2, you get what? 2140. Are you all able to understand this? As simple as that, guys. Now, one more scenario here. If I only decide to maintain a safety stock of 10 units, then up to 10, no problem. So, if someone walks into the demand of 100, 90 units stock out, 80, 70, 50, 40, 20, 10, and that's all. Guys, correct? Now, probability is 0.02, 0.05, 0.10, and 0.20. Is that clear, guys? 90, 70, 0.4, 0.1. Sorry, 90, 70, 40, and 10. Guys, correct? So, 90, 70, 40, 10. Repeat the same process, respective probability. Now, for every unit that you're running out of stock, you multiply that with 150. You arrive at the stock out cost, multiply that with the respective probability and add it up. You get the expected stock out cost. Now 10 units into, so what is the carrying cost? 50, you get 500. Add the 2, you get the total cost. Are you all able to understand? Now suppose if I'm saying that no problem, I will maintain zero stock, safety stock nil. In that case, what? You can handle window shoppers, no problem. Right, but all other scenario, you will run out of stock. Am I right? So 80, 100, 80, 50, 20, 10, 0.02, 0.05, 0.1, 0.2, and 0.3. So it completely enters your. So what will you do? So the respective stock out into 150 here. Yes, you will get the total stock out cost here, multiply it with the respective probability and add it up. This is going to be your expected stock out cost. Carrying cost is 0 because I don't hold any inventory. So the total cost is going to be 2,700. Now what will you do? Sir, so what is the amount of safety stock that I need to maintain? Go for the total cost column. Whichever one has the least total cost, you should go for that one. So the total cost is least when you maintain a safety stock of 20 units. Hence, it is recommended for the company to maintain 20 units as safety stock. Are you all able to understand? Is there any issue here? This is how you need to compute your safety stock, guys. Are you all able to understand? Perfect. And that's about this particular question. Right, guys? Fine. So, a very different question, a unique question, which many students don't understand. Right, the wordings of the question. Of course, there is also some issue in the wordings of the question. That's about it. Please go and update your library of adjustments. Write down stock out cost computation. Stock out cost computation, and that's about this particular concept, and that's about this particular question. So it's stock out cost computation. Now, let's move on to the next concept called as EOQ with price discount. Now guys, EOQ formula we've already seen. What is that? Root of 2AO by C. But this formula holds good only when there is no price discount. Guys, correct? What do you mean by price discount? He's saying at a time, if your order quantity at a time per billing, if you are placing an order for more number of units, then I will give you more discount. So purchase cost will come down. Guys, correct? Now, in the first scenario that we saw, the price will not change based on the order quantity. Am I right? Guys, correct? But now, what if the price is also changing based on the order quantity? Or in other words, when they are offering discount. Now, when there is no discount, only ordering costs and carrying costs are impacted by your order quantity decision. Correct? Suppose now they are going to give me a discount. In this case, even my purchase cost will be impacted by my order quantity decision. Am I right, guys? Right? Now, if I use this formula, root of 2AO by C, here ordering cost is considered, carrying cost is considered, but purchase cost is never considered here. First of all, whenever you have a price discount, in this case, your EOQ formula cannot be used. Are you all able to understand? Sir, can you give us an example? Please take the next sum, question number 11. With the help of this question only, we will do this. Now, this is what the supplier says. If you're ordering less than 250 tons, or in other words, 0 to 249 tons, if you're ordering, price will be how much? 6 rupees per ton, right? Suppose if you're ordering 250 to 799, between this range, if you have an order quantity, price is slightly less, 5.9, because you're increasing the order quantity. Suppose if the order quantity is between 800 to 1999, cost is 5.8. Suppose if it is 2000 to 3999, it's going to be 5.7. It's going to be 4000 and above. In this case, it's going to be 5.6. Is that clear, guys? Right? This is what they are saying. Now, depending on the order quantity, my price is also changing. No, guys, correct? Now here I can't use the formula root of 2AO by C, because we only consider ordering cost and carrying cost. Your purchase cost is also being dependent on what? Dependent on your order quantity. Hence, in this case, how do we do it? Are you all able to understand? That is the subject matter of discussion. Now, how do we do it? Very simple. In this case, there is no formula approach. You need to use only trial and error concept. Is that clear, guys? Now, how do you do trial and error? Now, if I keep order quantity as 1, right, what will be my purchase cost, what will be my ordering cost, what will be my carrying cost, total it up, right? If I keep my purchase quantity, order quantity as 2, total cost, 3, total cost, like that, try for 4000 alternatives, right, and arrive at the total cost. Go for that alternative which gives you the least total cost. Is that clear, guys? Now, this is how it needs to be done. However, in examination, can you do 4000 alternatives? No, in real life it's easy to do. Excel easily you can do. Formula and double click, it will automatically come down. That's about it. But in exam it is not possible, right? Hence, for examination purpose, what you need to do, in every range, take the lowest quantity, right? For example, here I will take 250, 800, 2000, 4000. For each of these alternatives, in first alternative alone, you don't take 0. Somewhere in between, you take one order quantity. Let us say 2000. So if 200, if you keep your order quantity as 200 or 250 or 800 or 2000 or 4000, for these scenarios, you compute what? Your purchase cost, your ordering cost, your carrying cost, and you compute your total cost. Right? Now total these three, and whichever gives you the least total cost, that will be called as your EOQ. Is that clear, guys? But in reality, it is not limited to 5 alternatives. You have 4000 alternatives, but for examination purpose, they are not testing you on the correct answer. They are testing you as to whether you know the correct approach. Is that clear, guys? Are you all able to understand? Is there any issue here? Now, with this context, let's go and revise one particular question, which is question number 11. What are they saying? From the following particulars, with respect to a particular item of materials of a manufacturing company, calculate the best quantity to order. What are they saying? So, if the order quantity is, so this range, they are given the price. The annual demand for material is going to be how much? 4000 tons, which means whichever I pick as order quantity, at the end of the year, overall I'm going to purchase 4000 tons. Is that clear, guys? Stock holding cost is going to be 20% of material cost per annum, which means what? Carrying cost they have given. Delivery cost per order. Ordering cost is how much? 6 rupees per order. With this, we need to compute what? EOQ for every single alternative. Shall we do this, guys? Yes. Now for this, you need to have a template. Have order quantity, right? Order quantity, number of orders. Number of orders, how will you arrive? A divided by order quantity. What is A? 4000, am I right? Yes, 4000. Then average inventory. How do you arrive at average inventory? 1 by 2 of order quantity. Guys, correct? Right? Next, what is carrying cost per unit per annum? We need to arrive at it. What is it? 20% on the purchase cost. Purchase cost, we know range wise it will differ. Hence, because of that, carrying cost will also differ range wise. Correct? Next, the total carrying cost. How will you arrive? Average inventory into carrying cost per unit per annum. That is 3 into 4. That's what I have mentioned here. Is correct? Then the total ordering cost. How will you arrive? Number of orders into ordering cost per order. 6 rupees flat. So second column into 6 rupees. Then total purchase cost. How will you compute? Don't say order quantity into purchase cost. No, it is annual 4,000 units, 4,000 tons. All the cases I will purchase. Guys, correct? So A into purchase cost per unit. Are you all able to understand? This is where many students commit a mistake. They take order quantity into purchase cost. No, in all these cases, overall I will end up purchasing 4,000 tons only. So it's A into purchase cost per unit. Then total cost will be 5 plus 6 plus 7. Total carrying plus ordering plus purchase cost. Is this clear, guys? Are you clear with the template? Yes? Now, the different order quantities I told you. In the first range alone, you take somewhere in between, right? We took 200. For all other ranges, the lower level needs to be taken. 250, 800, 2000 and 4000. 250, 800, 2000, 4000. Is that clear? Guys? Yes. Now, what is the number of orders? Take your calculator. So, it's going to be 4000 divided by 200 gives you 20. 4000 divided by 250 gives you 16. 4000 divided by 800 gives you 5. 4000 by 2000 2. 4000 by 4000 1. You got the number of orders. Average inventory, how much is it? Half of 200 is 100. Half of 250 is 125. Half of 800 is 400. Half of 2000 is 1000. Half of 4000 is 2000. Next one. Carrying cost per unit per annum. 20% of the respective prices. Calculator trick can we use? Yes. 0.2 into 6 is equal to 1/2. 1 second. 6 is equal to 1.2. Then 5.9 is equal to 1.18. Then 5.8 is equal to 1.16. Then 5.7 is equal to 1.14. And 5.6 is equal to 1.12. You got these figures? Yes. Now the total carrying cost, what is it going to be? So average inventory into carrying cost per unit per annum, 100 into 1.2 gives you 120. 125 into 1.18 gives you 147.5. 400 into 1.16 gives you 464. 1000 into 1.14 is 1140. 2000 into 1.12 gives you 2240. Is that clear? What is the total ordering cost? Ordering cost will be 6 into the number of orders. So 6 into 20 is equal to 120. 16 is equal to 96. 5 is equal to 30. 2 is equal to 12. 1 is equal to 6. Right? And the total purchase cost is going to be 4000 into the respective purchase cost here. Guys, correct? Price here. So 4000 into. So these respective figures, if you do, you will get this 24,000 and it keeps on going. Guys, correct? Right? I'm not getting into the calculation since this being a marathon here. Right? So now what do you do? Add these three. You will arrive at the total cost for each of the alternatives. Now, choose the one which has the least total cost. The least total cost happens when your order quantity is going to be 800 tons. Hence, 800 tons should be the order quantity. So, this 4,000 tons you are going to order as a whole. Yes. Place the order in number of 800 tons, which means the total number of orders has to be 5. Is that clear? So 800 tons you purchase at a time, right? Like that you purchase for 5 times, you will make sure that you will purchase totally 4,000 tons. Is that clear, guys? So EOQ with price discount, there is no formula method. You only need to do using what? You only need to do using your trial and error method. Is this clear for everyone? Guys, that's about this particular concept of EOQ computation with discount. So please go and update your library of adjustments. Write down EOQ computation with price discount. EOQ computation with price discount. EOQ computation with the price discount. Is that clear, guys? Fine. Now, guys, there is a next concept called as issues valuation. Now, guys, this particular concept, I am not going to do it in the marathon because this is something which you would have already studied in your CA foundation, right? And as well as CA or CMA foundation, you would have already studied this particular concept. What is this? Basically, this is nothing but your FIFO, LIFO, weighted average, simple average method and all. Now, direct, they ask you to prepare some stores ledger. This is something that you would have already done. Date, particulars, your receipts, issues, balance, under that quantity, rate, amount. First in, first out means what? The first lot should be utilized against the issues first, and then go to the next lot. Guys, correct? LIFO means first completely exhaust the last lot, come in the descending order. Guys, correct? And weighted average means the total value divided by total units. Simple average means take only the price and arrive at an average of that. Now, these are things which you would have already studied at your foundation level, which is very much there at the intermediate level, which we see in detail in our regular and exam oriented batch. But for the purpose of marathon, since it is a direct area, so I am just giving you a bird's eye view of that. This is very much easily manageable, right? Now, let's go on to the next concept called supplier selection. One second. Yes, let's go on to a next concept called as supplier selection. Now, please take question number 16. Please take question number 16. So all these things we have done in our regular batch. That's why, it's all annotated here. Yes, question number 16. Now, a very good question. Now, after inviting tenders, 2 quotations are received as follows. Supplier A is saying for every unit, you will have to pay how much? 4.4. Supplier B says, sir, you pay me only 4.2 plus flat 4,000. You are required to calculate the order quantity for which the purchase price per unit will be the same under both alternatives. Number 2, select the supplier if the purchase department wishes to place an order for 15,000 units. Now, guys, which supplier is better, A or B? Now, guys, this is ideally a concept of indifference point which we have seen in our marginal costing chapter. Sir, how's our indifference point? Now, if you notice here, now there is a supplier A. Now, how much does he charge? 4.4 per unit. Does he charge anything flat? No. Whereas supplier B, he says, per unit you pay me 4.2 plus you pay me a flat 4,000. Or in other words, these two guys, right, they have a variable component and a fixed component. Am I right? In this case, A's fixed component is 0. Now, the advantage of A is that he has a low fixed cost. In this case, no fixed cost. Is that clear? The advantage of B is that he has a low variable cost. Is that clear, guys? So now you can't come to the conclusion and say, sir, always A is better, always B is better. No, each of them have one advantage and one disadvantage each. Hence, it is not as simple as saying who is better always. No. Are you all able to understand? Now, this is where the concept of indifference point come in. What do you mean by indifference point? The point where whether I purchase from supplier A or I purchase from supplier B, the overall cost remains to be the same. So, how many number of units should I purchase exactly so that the total cost under A is equal to total cost under B? This is called as indifference point. Now, what is the total cost under A? 4.4x. Let x be the number of units. 4.4x plus 0. Guys, correct? Hello? Yes, this should be equal to 4.2x plus 4,000. Am I right, guys? Right? So now bring x onto one side. Right? So this is going to be 4.4x minus 4.2x is equal to 4,000 minus 0. Or if you take x out in common, x the whole into 4.4 minus 4.2 gives you 4,000 minus 0. Or x is equal to 4,000 minus 0 divided by 4.4 minus 4.2. This comes out to 4,000 divided by 0.2, which is going to be 20,000 units. Is that clear, guys? Now, if I exactly purchase 20,000 units, the total cost, if I purchase it from A, and the total cost, if I purchase it from B, will be exactly the same. Is that clear, guys? Are you all able to understand? This is called as indifference point. Sir, with this indifference point, what am I going to do? How will I arrive at a decision? I will tell you. Now guys, let us say you are a person who is dealing in very less volume. Okay, you are a person who is dealing in very less volume. Let us say you want to buy only 1 unit. Okay, you rationally think and tell me whether will you buy it from A or will you buy it from B? Will you buy it from A or B? From whom will you buy? A or B? You will obviously buy it from A. Why? Just 4.4 rupees you need to pay. Whereas if I have to pay buy it from B, sir, 4.2 rupees only per unit, no? Plus flat you should pay 4,000. Guys, correct? Or in other words, when your volume is low, the overall component of your cost, the total cost, is predominantly driven by your fixed cost. Guys, correct? So you will go for that alternative which gives you the lower fixed cost. Are you all able to understand? Guys, clear? Because variable cost is very less when my volume is low. Guys, correct? Suppose if I am purchasing it from B, 4.2 only per variable cost, but fixed cost is going to be 4,000 rupees. So the significant component of my total cost will be fixed cost. Hence, when my volume is low, I will go for that option that gives me a lower fixed cost. Suppose you are planning to purchase, let's say 1 lakh kgs, like 1 lakh kgs. In that case, your overall cost will be predominantly driven by variable component. Hence, you will go for that alternative that gives you a lower variable cost. Is that clear? In that case, you will go for B. Are you all able to understand? Now, sir, now, where did this indifference point come in? Don't worry. Now, at the indifference point, you will either go for A or you will go for B, because both will give you the same result. If you want to purchase units which is less than the indifference point, you should go for that option that gives you a lower fixed cost. Is that clear, guys? In this case, it is A. If you are planning to purchase units which is more than the indifference point, you'll go for that alternative which gives you a lower variable cost per unit, which is in this case going to be B. Is this clear, guys? Right? This is the reason why we compute indifference point, and based on the indifference point, we can arrive at the decision directly. 15,000, 20,000 units is the indifference point. Now, sir, I want to buy 10,000 units, sir. Go for A. Just like that I can say, because you try and calculate, it will always be less. Sir, I want to buy 30,000 units, sir. Then go for B. So, I will clearly have a demarcation as to when to purchase from which vendor. Are you all able to understand? This concept is called as supplier selection. Is that clear, guys? This is basically a decision making area. The second part of the question they have asked, select the supplier if I wish to purchase an order for, place an order for 15,000 units. From whom will you purchase? Yes, sir, it is less than 20,000. Hence, I will purchase from A. Are you all able to understand? As simple as that, guys. So, the concept of marginal costing is being mixed in the concept of material cost. And this concept is called as supplier selection. Is that clear, guys? Fine. That's about this particular area. Of course, indifference point, directly if you want to apply the formula, it's going to be 4,000 minus 0 is nothing but difference in fixed cost divided by 4.4 minus 4.2, this is nothing but difference in variable cost per unit. We have already seen that in marginal costing. So, difference in fixed cost divided by difference in variable cost per unit, it gives you 20,000 units. Is that clear, guys? By the way, marginal costing has already been uploaded in part 1. So, please watch that in case you want to get more clarity on the concept of indifference point. Fine. So, now with this, we have completed this particular question. Please go and update your library of adjustments. Write down supplier selection. That's about it. Supplier selection. That's all. Now, guys, let's move on to the next concept called as ABC analysis. ABC analysis. Now, here ABC does not mean activity-based costing. It is completely a different concept as a whole. Now, guys, you guys generally do this ABC analysis. What is it that you do? During your exam, you will say A category means most important, B category means somewhat important, C category, omit category. Yeah? Yes. So, you guys do that, no? Right? So, never omit anything. Now, prioritize, that is okay. Now, similarly, now that ABC, that is the order of importance, is what this particular concept talks about. And guys, this particular concept helps you achieve objective C of our subject, which is control. Is that clear? Now, what is this? Now, this ABC analysis is based on the concept of Pareto rule. What is Pareto rule? There was a guy called Pareto. He invented this rule. It's popularly called the 80-20 rule. Now what he says, 80% of the population, global population, controls 20% of the wealth, which means the remaining just 20% of the population control 80% of the global wealth. So if you are the income tax department, now you will give more focus on the 20% of the population. Why? If you give focus on 20% of population, you can get control on 80% of the wealth. Guys, correct? For example, let us say the total wealth in the entire world is 100 crores, right? And let us say 100 people are living in this world. Example I'm saying. Now, what Pareto says is 100 crores the total wealth. Out of that, 80 crores are being held by just 20 people. The balance 80 people put together control only 20 crores. Is that clear? Which means what will you do? You will give extreme importance to this 20 people. Let's say you are income tax department. You want to get control over significant component of the wealth. You will focus on these guys. Guys, correct? Are you all able to understand? And the balance 80, it's okay. Though they are more in number, in value they are very less. Are you all able to understand? Now, this is exactly what happens in a company also. What they are saying, there are so many different types of raw material that we have, right? But understand, there are certain raw materials which are less in number, but more in value. There are certain raw materials which are more in number, but less in value. For example, I'm a car manufacturer. In a car, I need only one engine, guys, correct? Which means engine in terms of quantity is very less. Only one engine per car is required. Whereas, if you look at the same car, I need so many nuts and bolts. No, I need 1,000 nuts and bolts. Now, nuts and bolts are huge in quantity, but in value, it is nothing. Guys, correct? Now, what this ABC analysis says is, look, you categorize your raw materials into A category, B category, C category. Now, for A category materials, give a very high level of control, very important. Now, A category are generally low in number, more in value. Example, engine. Guys, correct? Next, moderate B category items, you give a moderate level of control. They are moderate in terms of, medium in terms of number of quantity, and moderate in terms of value. C category, they are high in terms of quantity, nuts and bolts, but very low in terms of value. Give them the low level of control. Now guys, when it comes to control, we saw the concept of stock levels, reorder level, minimum level, maximum level, average level, and we saw reorder quantity, EOQ formula, everything. Now I have 25,000 different types of stocks. Now you tell me, can I exercise the same level of control for even a nut and bolt and the engine? No, it is really not possible for a company to exercise the same level of control. Hence, what they do is they categorize their raw materials into A, B, and C category. A category, there is no shortcuts, 100% control they will do. B category items, moderate level. C category item, least level of control. Are you all able to understand? Is there any issue here? Right? This is actually called as selective inventory control. What is it called as? Selective inventory control. Means what? I select the categories of inventory based on the category and rating. I actually give them control. Is that clear, guys? Right? This is actually stems out from a concept in your business studies, right? In your MBA, they will be seeing. Of course, even in your school days, you might have seen in your business studies, there's a concept called as management by exception. Right? It means you take the exceptional items out and you give more control on them. This is called as management by exception. Now, sir, how do I carry out ABC analysis? Let's go and do one numerical problem. With the help of that, we will be seeing it. Shall we get started, guys? Right. I'm just going to share the procedure of doing it. Computation part, let's not get into it right now. In our regular and exam oriented batch, we do the computation in detail. In fact, whatever notes I'm sharing here, there's all these things. I did it manually along with the students. That's how we do it. In a marathon, since there is a limitation of time, So we will quickly understand the concept and the structuring of these questions. Now let's get started with this question number 70. Now, from the following details, draw a plan of ABC selective control. What have they said? Item number. So there are 12 different types of items, means raw materials, right? Now, raw material 1, physically how many units are there? 7,000 units. Per unit, what is the cost? 5. Like that, for every type of raw material, physical units they have given, and they have also given the per unit cost. With this, you need to chart out your ABC selective control system. How to do that? Very simple. First, we need to prepare a statement of total cost and rank it. How do you do? So, items 1, 2, 3, 4, 5, 6 till 12. Units, all these are physically given. Now, what you need to do is, you need to compute percentage of total units. What is this percentage of total units? Now, all the units you add up, physically I have a total of 2,19,000 physical quantity units with me. Now, item number 1 is 7,000 divided by 2,19,000. It comes closely to around 3.1963 percentage. Means what? Item number 1 contributes to 3.19 percentage of physical value. I mean, of physical units. Is that clear? Not in terms of value. Overall, in terms of quantity. So, this item number 1 contributes to 3.19 percentage in the physical quantity. Is that clear, guys? Like that, item number 2, 24,000 by 2,19,000. Physically, if you see, 10.95 percentage of the total units are coming from what? Item number 2. Like this, for every item, you need to arrive at the percentage of total units. Is that clear? Then, have the unit cost. Copy paste from the question. Total cost will be units into unit cost. So 7,000 into 5 gives you 35,000. 24,000 into 3 gives you 72,000, and so on. So what you need to do, item wise arrive at the value. Now the total value of inventory that I hold is going to be how much? 3,55,770. Now calculate each item as a percentage of the total value. For example, item 1 is going to be 35,000 upon 355,770. That's going to be 9.83 percentage. Item number 2 is 72,000 upon 355,770. That's going to be 20.23 percentage, and so on. Now calculate this in terms of the total value, percentage on the total value, total cost. Is that clear? Now we need to do the ranking based on the percentage of total cost. Means what? So the highest will be actually item number 11. How? It contributes to 22.95 percentage of the total value of raw material. So 22.95 percentage of the total value of raw material comes from item number 11. Is that clear, guys? So you can mark it as rank number 1. Rank number 2, the next high category item. So item number 2, it contributes to 20.23 percentage of the total value of the raw material. So item number, the next ranking is 3. This is for item number 5, 16.0216 percentage, right? And then 4 is going to be 9.8378 percentage. This is from item number 1. So based on the percentage of total value in the descending order, you will actually do the ranking. Is that clear, guys? Highest contribution percentage will get the first ranking, and then go to the next, and so on. Is this clear, guys? Right? Now, once you do the ranking, now you need to get into another table. But before that, there has to be a basis on which you need to segregate your raw materials into A, B, and C. Generally, this will be given in the question. Now, if a raw material is 50,000 rupees or more in value, I will categorize it as A category, and for A category I'll give high control. If it is between 15,000 to 50,000, put it under B category, moderate control. Below 15,000, put it under C category, low control. Is this clear, guys? Now generally this will be given in the question. In this question it was not given, since hence we took assumed, but generally it will be given in the question. Without that you can't do. Is that clear, guys? Now what will you do? On the basis of rank, you need to put it up here. So rank number 1, 2, 3, right? Rank number 1 comes from item number 11, guys, correct? Now item number 11, if you see, what is its contribution to the physical units? 5.85, correct? 5.8512, 5.2512, sorry, 5.2512. This is its contribution in terms of physical units. Now what is the value of this? 81,650. Put it here. And what is its contribution as a percentage? What is the contribution to the total value? It's 22.9502. Now the value is how much? 81,000. More than 50? Guys, correct? Hence, I will give it as A category. Similarly, if you notice, rank number 2, rank number 3, these items are also more than 50,000. Hence, it comes under the first ranking. Is that clear, guys? Now, if you total the percentage and see, now what we are saying, approximately just 3 items, contribute to 60% in value. However, if you look at it in terms of physical units, it only comes to about 33% in physical units. Guys, are you clear with this? Just being 33% in physical units, it contributes to 60% in value. Pareto analysis comes into picture. Are you all able to understand? Hence, A category items, if I just control 33% of my overall physical inventory, I will get a control on 60% of the total value. Is this clear, guys? Hence, these three takes the topmost priority. Next category is 15,000 to 50,000. Guys, correct? So anything between 50 less than 15 will come here. Anything between, more than 15 less than 50 will come here. Guys, correct? Right? This is B category. If you add up, you will find moderate level. That is, it contributes to 26% of value. And in terms of physical units, it comes close to around 24%. More or less, the value and the number are more or less matching. Guys, correct? It is moderate level. Is that clear? And then C category, if you see, 42% in physical units contribute to only roughly around 14% in value. Hence, we give it as a C category, least level of control. Is this clear, guys? Are you all able to understand? This way, this manner of presentation is called as a ABC analysis. Are you all able to understand? Right? There is no specific calculation in terms of arriving at the answer. This is how you need to do and leave it here. So first step, do the ranking based on what? Percentage of total cost. And second one, based on the range, arrive at the category and arrive at the total of percentage of total cost and percentage of total units. So 33% of units will contribute to 60% of value. 24% of units will contribute to 26% in value, and 42% of units will contribute roughly to around 14% in value. So physically they are huge in number, like nuts, bolts, screws, spares, all these things, but value wise it is nothing. Hence only C category I give them. Are you all able to understand this, guys? Right? And that is the concept of your ABC analysis. Are you all able to understand? So this also gets tested then and there. In case this comes in your exam, you now know how to handle it. Please go and update your library of adjustments. Write down question number 17, give all the cross-referencing and write down ABC analysis. Write down, guys, ABC analysis. And that's about this particular segment. Now let's go on to the last segment of discussion in this chapter, which is inventory turnover ratio. Now guys, inventory turnover ratio. So what is the formula to calculate inventory turnover ratio? Ideally, this inventory turnover ratio is there in your financial management paper, ratio analysis chapter, right? But in this chapter also, they have kept this concept of inventory turnover ratio. The formula for calculating inventory turnover ratio is cost of materials consumed divided by average stock of raw material. Here, by inventory, there are three types of stocks, no? What are the three types of stocks? RM, WIP, and FG. Am I right, guys? Now, we are in which chapter? Material cost. Hence, we are only talking about raw material. What is the formula to compute this? Cost of materials consumed during a year or a period divided by average stock of raw material. Average stock means what? Opening stock plus closing stock divided by 2. Is that clear, guys? Now, sir, why do we compute this? Let us say, guys, I have a raw material A. In a year, I consumed total raw material A. The annual raw material consumed was worth how much? 12,000 rupees. Let us say on an average, I maintain the stock of raw material of how much? 1,000 rupees. I always maintain 1,000 rupees worth of raw material. Is that clear, guys? Now, as per this formula, inventory turnover ratio is how much? Raw material consumed divided by average stock of raw material. I get it as 12 times. Now, what is the meaning of this? Very simple. In a year, I consumed raw material A worth 12,000 rupees. And generally, I maintain a stock of how much? 1,000 rupees worth of raw material. Or in other words, I will say, I first bought 1000 rupees worth of raw material, right? It got emptied. Once again, I purchased 1000 rupees worth of raw material. It got emptied. Once again, I purchased 1000 rupees of raw material. It got emptied. Like this, I purchased my raw material and it got emptied. Once again, I purchased and it got emptied. Like this, it happened 12 times in this year. Guys, are you all able to understand? This is called as stock turnover ratio. Are you all able to understand this? Are you all able to understand this? So what is the meaning of this stock turnover ratio? It represents how many number of times your stock got refilled and emptied, refilled and emptied, refilled and emptied. Are you all able to understand? So in this year, it got over how many times? 12 times in this year. Guys, correct? Guys, correct? 12 times. Now you tell me, which means can I say once a month it gets over and I will actually replenish it once again. So and once again after 1 month it will get emptied. Guys, correct? How long does it take for me to empty this one batch? It actually takes me 1 month. Guys, how do you get this 1 month? Very simple. 12 months divided by the inventory turnover ratio 12 times. That's how you did it, no? Guys, correct? So 12 months divided by 12 times, I get 1 month. Now 1 month is what? This is called as stock holding period. What is it called as? Stock holding period. Or in other words, if I purchase a raw material A today, it will take 1 month for me to empty it. Guys, correct? Right? Are you all able to understand? And once again, if I purchase another lot, it will take 1 more month for me to completely empty it. Are you all able to understand? Guys, are you all able to understand? So what is the formula for inventory turnover ratio? Raw material consumed divided by average stock of raw material, right? Then with this, what will you do? You can arrive at the stock holding period. How will you do this? 12 months or days if you want, 365, or if you want it in weeks, 52 weeks divided by inventory turnover ratio. With this, you can calculate how long you are holding the stock, or in other words, how long it takes for you to empty the stock. Is that clear, guys? Yes? Now, so with this, what are we going to do? I will tell you. Let us say there is another stock, raw material stock called B. Okay, inventory turnover ratio 12,000 divided by 2,000. How much is it? 6 times, which means in this year it got emptied, refilled 6 times, which means how long does it take for me to empty it once? So 12 divided by 6, it takes 2 months. Is that clear? Now with this, what can I do? I can analyze and find out. Look, raw material A gets emptied quickly in just 1 month, whereas raw material B takes 2 months to actually for me to consume. Are you all able to understand? Or with this, I can make one analysis. Raw material A is a fast moving stock. Raw material B is a slow moving stock. Is this clear, guys? Are you all able to understand? Now, if you go to a shop and all, now they will give some discounts, no? They will give discounts only on products which are slow moving. They will never give discounts on fast moving stock. Why? Because anyways, they know it will be sold. Only to push the sales, they will give you discount on slow moving stock and all. Guys, are you all able to understand? So with the help of this particular stock holding period, you will do something called as FSN analysis. What is it called as? FSN analysis. Full form: fast moving, slow moving, non-moving stock. Is that clear, guys? Based on this, you can categorize which stock is under which category, and accordingly you can take corrective actions. Is that clear? Suppose in this case, raw material B is in slow moving category. Now immediately what will I do? I will try to dig out the reasons and find out why is it slow moving. Then I will try to push it and convert it into a fast moving category. Is that clear, guys? Are you all able to understand? Right? So I should know where I stand, guys. Correct? For that purpose, I compute the inventory turnover ratio. With the help of inventory turnover ratio, we can compute the stock holding period, and with the help of that, you can do FSN analysis. With the help of FSN analysis, you will know whether your stock raw material is fast moving, slow moving, or non-moving. If it is non-moving, means it is not all moving. Now it's got dead stock. What will you do? Don't keep it with you. Immediately scrap it off, realize some income and close it. Are you all able to understand? But slow moving, if it is there, try to improvise certain measures, bring it under fast moving. Is that clear? If it is fast moving, try to maintain it. Are you all able to understand this? This actually gives you to exercise control over your inventory. Are you all able to understand, guys? Yes? Fine. That's about this concept. Let's go and do one sum. Please take the next question, number 18. Right? The last concept in this particular chapter. From the following data of the year ended 31st of March, calculate the inventory turnover ratio of 2 items and look, put forward your comments. No comments, huh? Right? You will have to write your comments. For you to write the comments, first you should understand the concept, guys. Are you all able to get this? So you can't directly jump to the conclusion or comments by just mugging up and doing something. No, it doesn't work that way. Are you all able to understand? Now, how do we do this? Now, raw material wise, they have given opening stock, purchase, closing stock. Now, what is the formula for calculating inventory turnover ratio? Everyone. Raw material consumed divided by average stock of raw material. Guys, correct? Average raw material is what? Opening plus closing by 2. That you know. Now, in this case, what is the raw material consumed? Now, raw material consumed is not purchased. It is opening plus purchase minus closing. Recall, raw material you have opening raw material, opening stock plus purchase gives you the total raw material available. Out of this, partly you can consume, partly will remain in your closing stock. Now, with this, how can I find out raw material consumed? Opening stock plus purchase. This is the total available. Out of that, how many kgs I have not consumed? The balance will give me what? The raw material value of raw material consumed. Are you guys able to understand? Hence, it will be what? 10,000 plus 52,000 minus 6,000. How much is that? 56,000. This is the raw material consumed. Are you clear with this? A. B is going to be 9 plus 27 minus 11. How much is that going to be, guys? 25. Guys, 25,000. So 56 and 25. You got the raw material consumed. Numerator, denominator. 10 plus 6 by 2. That's going to be 8. 8,000 here. And here it's going to be 9 plus 11 by 2. 10,000. Right? So now 56,000 by 8,000. How much is it? 7 times. 25,000 divided by 10,000. How much is it? 2.5 times. By looking at this itself, you can say material A has turned over 7 times. Means what? Means what? So many number of times it has got over and we replenished it. Got over and we refilled it. So which means if it means it is fast moving. No, guys, correct? Now, how will you arrive at the stock holding period? Simple. In a day, in a year, how many years, how many days are there? 365 divided by 7 gives you how much? 52.14. Rounded off. 52 days, or in other words, if I purchase raw material A today, it will take 52 days for me to completely empty it. Guys, correct? How about B? 365 divided by 2.5. So it will take 146 days for me to actually empty raw material B. With this, what can you conclude? You can say raw material A is relatively fast moving as compared to raw material B. Don't say this is fast moving, this is slow moving. No, we do not know. It depends on the industry also. We can only say between these two materials, this is fast moving. Material A is moving faster than material B. For you to write this comment, you should know that you should arrive at inventory turnover ratio. That is anyways given in the question. The next one is what? You need to arrive at the stock holding period, inventory holding period. Based on this only, you can arrive at the comment. Are you all able to understand? Right? And that is about this particular question. Please go and update your library of adjustments. Write down inventory turnover ratios with comments. Inventory turnover ratio with comments. We done? Yes. And guys, with this, we are done with this particular chapter. So literally, guys, we have seen components of material cost. Guys, correct? We saw EOQ without price discount, root of 2AO by C. EOQ with the price discount. We saw stock levels. What are the different stock levels? Reorder level, minimum level, maximum level, average level, danger level. Guys, correct? Then issues valuation. We see that in detail in our regular and exam oriented batches, right? But right now, for the purpose of this marathon, since it is a foundation level area, so I didn't do it here. Then stock out cost, we did the sum. You remember tyro tubes and tires, right? ABC analysis, we did inventory turnover ratio. This is also we did. In fact, we did one more concept called as this one. Supplier selection, indifference point. Good. Supplier selection, that also we did. Treatment of losses, that is normal loss, abnormal loss. Ideally, it is a part of discussion in process costing. So that's a technical area in process costing. Hence, that also I have just reserved it. It's not for this purpose of marathon. So that's a detailed discussion which we generally do during our process costing area. But in this chapter, generally, if they test, it comes only from the areas which we have discussed till now. Is that clear, guys? Right? A comprehensive coverage for around 2 hours. Literally the entire chapter with the numerical problems we have done. Guys, now one last time I want you all to tell me stock levels. Come on, guys. Come on, everybody, online folks, whoever is watching this, come on. Tell the formula. Assume I'm standing in front of you. Tell to the screen it's okay. Come on, guys, everybody. First, reorder level formula. Maximum consumption into maximum lead time. Your mom will not let you go to bed with a hungry stomach, right? Next one. Minimum level formula. Reorder level minus normally what happens? Average consumption into average lead time. Next, maximum level formula. Reorder level minus everything happens in my favor. Minimum consumption into minimum lead time. Now that guy rings the bell and yes, plus reorder quantity. Next, average level formula. Two formulas. One is normal mathematical formula, arithmetical formula. Minimum level plus maximum level divided by 2. But logical formula. Minimum level plus half of reorder quantity. Next, finally, danger level formula. Average consumption into lead time during emergency purchases. Excellent, guys. Very good. That's all it is. And inventory turnover ratio formula. Raw material consumed divided by average stock of raw material. That's about it. EOQ formula. Root of 2 AO by C. Literally, you guys have told all the formulas in this entire chapter. And that's about this chapter. And whatever formulas that you can find in this chapter, guys, I have neatly put it in, a different, ink, not only this chapter, throughout the subject for both costing and FM in our concept decoder. Literally, this itself is your main source of preparation, and this itself can be acted as a revision book also for you, right? You can revise from the same book which you used to prepare initially. Literally all the formulas are mentioned, and logic also we have seen. In fact, in our regular course and all, we actually spend more time and we spend more detail on the logics and detailed sum solving. But here, due to a shortage of time as well as for revision purpose, we are condensing the discussion, and that too, guys, in a span of just about 2 hours, this entire chapter, which is important from an examination perspective, we have covered. Is that clear, guys? Fine. So with this, we have completed this chapter called material cost. So now let's move on to the next one. So now let's get started with the revision of the next chapter called service costing, right? So this chapter is also called as operating costing, right? Service or operating costing, not operation costing, operating costing. Now, guys, once again, this chapter is a common chapter for CA and as well as CMA students. If you're doing CMA also, then this chapter is there in your paper 8 cost accounting. Now, guys, coming back here. Now, this chapter, once again, gets tested every single attempt. At times for 10 marks or at least for 5 marks, it gets tested. This is how this chapter is. And the importance of this chapter is all other chapters revolve around the production and manufacturing of goods. Whereas this is the only chapter that deals with your service sector. Hence, this chapter is important both from an economy perspective, real life, as well as from your examination perspective. Now, guys, in this chapter, as per the syllabus, we have different service sector costing. Transportation sector. Under transportation sector, we have goods transportation, passenger transportation. Then we have hotels and lodges, hospitals, information technology, IT companies like Cognizant, Wipro and all, toll roads, educational institutes, insurance, financial institutions, and or electricity related companies, powerhouses, right? Koli powerhouse, right? Now, guys, most important sector is this transportation sector. This is the most important sector for us, right? And apart from that, hotel and hospitals, these two are also important. Generally, your exam questions will come from these areas. It can also come from other areas, but other areas are nothing great. They are not that difficult and all. They are very direct. The biggest challenge is with respect to these areas, more specifically to the transportation sector. That's where you have different varieties of problems as well. Fine, guys? Right. Now, in this chapter, the most important and the crucial point in service costing is that now in case of a manufacturing company, right, I will compute the cost per unit. Let us say I am a pen manufacturer. For me, what do I sell? I sell the pen, right? So I compute the cost per pen, right? Arrive at the profit, add the profit, arrive at the selling price, guys. Correct? I know what is my cost object. What do you mean by cost object? The object for which I am computing the cost. For example, I am saying 20 rupees. So 20 rupees, what is 20 rupees? 20 rupees for what? 20 rupees per pen, which means here pen is the cost object. The object for which I compute the cost is actually called as cost object. If I am in the manufacturing sector, the cost object is easily identifiable. So the product that I manufacture is called as a cost object. Whereas in case of a service sector, now identifying the cost object is the first major challenge for us. For example, I am in a transportation business, right? Now, Ola, Uber, you guys book. Now, here, Ola, Uber, what business are they into? Selling car? No, they use this car, they provide a service to you. They only transport you from one place to another. Guys, correct? Right? In this case, what is their cost object? How do they arrive at the cost? How will they fix the selling price? On what should everything be calculated? Is the question, guys. Hence, in transportation, in our service sector wise, my cost object will be different. Is that clear, guys? That is the first and foremost important thing here. Are you all able to get this? Yes. Now, guys, let me take an example. Now, in this chapter, the most important thing is find out the cost object. Now, how many of you have gone to IRCTC website? Almost all of you, right? Now, if you go to IRCTC website for booking your train tickets, now, two things they will ask you for sure. One is your starting point and destination. The other one is your number of passengers. Right, guys? Yes. Now, why do they need these two data? Now, I will tell you. In case of your transportation sector, in this case, passenger transportation, now, what they do is, their charges are arrived on the basis of per passenger per kilometer. It's popularly called passenger kilometer. Let us say they will have a tariff. Now, for one passenger to transport that one passenger for 1 kilometer, let us say I will charge 1 rupee. This is how they will actually, here the cost object is passenger kilometer. Sir, why, sir? I will tell you. Now, they ask the starting point and destination. With this, they can arrive at the distance. Let us say I'm traveling from Chennai to Hyderabad, right? Let us say approximately the distance is 800 kilometers, right? Now, they will know per kilometer, they will charge 1 rupee, which means you're going to travel 800 kilometers, they will charge 800 rupees. Guys, correct? Now, you said, okay, sir, very happy. Suppose they are saying the tariff is 1 rupee per kilometer. That's all. They're saying, what will you do? No problem, sir. What is the distance? 800. 800 into 1, 800. So you will pay 800 rupees and you will take 100 people with you. Now, is it fair? No. What is the meaning of that? Sir, the charge is 1 rupee per passenger per kilometer. For us to transport one passenger for 1 kilometer, the charges are 1 rupee. Guys, correct? Now that's the reason why they ask for the second detail. How many passengers are there? Are you all able to understand this? Right? Which means, suppose 800 kilometers are there. 2 passenger you are booking the ticket. What will they do? So, per passenger per kilometer, it is going to be 1 rupee. So, 1 into 800, it is going to be 800 rupees per passenger into 2 you need to do, only then you'll get the total ticket value of 1600 rupees. Are you all able to understand? Or in other words, they are transporting 2 passengers for 800 kilometers, right? 2 into 800 is going to be 1600 passenger kilometers, right? Per passenger, per kilometer, the charge is 1600 into 1600. That way also you can arrive. Are you all able to understand? Or in other words, in service sector, you don't have a single cost object, you have multiple cost object. This is popularly called as composite cost object. Composition means what? More than one. So composite cost object means there is more than one cost object together that drives my cost. Are you all able to understand? This is one uniqueness about service sector. And another uniqueness about service sector is there is no concept of closing stock, opening stock. You can't stock service, no, you're not dealing in a product. Are you all able to understand? Hence, the stock valuation issue and all is not there in this sector at all. Are you all able to understand? These are the two major issues in our service sector. Is that clear? Now, let us take an example. Hotel sector. Now, let us say you want to book a hotel room. You have gone somewhere for, let us say you have gone for, a vacation, right? You want to book a hotel room. Now, how will they charge you? Now, if they say 1000 rupees per room, sir, what will you do? What will you do? You will pay 1000 rupees, right? You will pay 1000 rupees and stay in that room for 1 month. Will they accept? No. They will say, sir, 1000 rupees per room per day. So here room days per room per day will be the cost object. Clear with this, guys? If they just say, sir, 1000 rupees per day, sir, then what will you do? You will pay 1000 rupees. One day only you will say, but you will take, sir, entire hotel, there are 50 rooms, no? I will take all the 50 rooms, so only 1000 rupees I will pay. Why? You said 1000 per day only. You wouldn't say whether it is per room and all. So it is very clear, 1000 rupees per room per day. If you want to take one room for 1 day, the cost is 1000. Is that clear, guys? Hence, it is also driven by composite cost object. Are you all able to understand? This is one very important thing that you need to get it. Is that clear, guys? Fine. So now, similarly, if I am in goods transportation, they will say per ton per kilometer we will charge you so much. So to transport 1 ton for 1 kilometer, so much is the charge. Is that clear, guys? So if you want us to transport 50 tons, multiply that with 50 and number of kilometers you multiply. Is that clear, guys? Are you all able to understand? Here, the ton kilometers is going to be your cost object. Are you all able to understand this? This is a very, very important understanding in service sector. Is that clear, guys? Now, with this background, let's get started with the first sector called as your transportation sector. Under the transportation sector, now we will do one sum under your goods transportation and one sum we will do under passenger transportation. Shall we get started? Yes. Now, guys, in goods transportation, right, let us take an example of goods transportation. I told you what is going to be the cost object? Ton kilometers. Am I right, guys? Now, this ton kilometers can be calculated either using weighted average method or using simple average method. Weighted average method is also known as absolute ton kilometers or absolute method. Simple average is also known as commercial ton kilometer or commercial basis. Is that clear, guys? Now, the manner of computing my ton kilometers, for example, let us say, guys, let us say I'm a pen manufacturer. I incur a total cost of 1 lakh. To produce how many pens? Let us say 10,000 pens, 10,000 units. The cost per unit is how much? Rupees 10. Guys, correct? Now, in the denominator, I have units, no? This is my cost object. Now, in case of a service sector, what is the cost object? In this case, that is your goods transportation, the ton kilometers is going to be your total ton kilometers is going to be your cost object. Am I right? Now, what will I do? So, the total cost incurred divided by total ton kilometers, I will arrive at the cost per ton kilometer. Right? Now I know for every unit that I'm dealing it, in this case it is ton kilometer, what is the cost? Accordingly, I can charge my customers, guys, correct? Or in other words, the ton kilometers is nothing but your denominator computation. Am I right? Now, how do I compute the denominator? There are two ways in which you can compute it. One is weighted average method, also known as absolute basis. The other one is simple average method, also known as commercial basis. What are these two methods, sir? How do you compute? We will see this with the help of the first question. So please go and take. This is in volume number 2. The page number is continuous only, but this is in volume number 2. right guys? So if you notice, this is in our volume 2 of our solved question bank. So please take this. Right, if you notice, in your first volume, these chapters are there. Second volume, service marginal standard budget and all these things, MCQs and all are there. Fine. Now let's go on to this first question. Look at this. A lorry starts with a load of 20 MT, stands for metric tons, of goods from station A. It unloads 8 tons in station B and the balance goods in station C. In return trip, it reaches station A with a load of 16 metric tons loaded at station C. The distance between A to B, B to C, and C to A are 80, 120, and 160 respectively. Compute absolute metric ton kilometer, commercial metric ton kilometer. What are they saying? Now, there are 3 stations, A, B, C. Now, distance between A to B is how much? Given here, 80 kilometers, right? Next, distance between B to C is 120 kilometers given. Distance between C to A is 160 kilometers given. Now, A to B, I transport how many weight? What is the weight I transport? How many metric tons? 20 metric tons. B to C, I transport how many metric tons? I transport 12 metric tons. Am I right? It's given. How do you know 12? Now, they have given here, lorry A, it starts from A, it goes to B. At B, it unloads 8 metric tons. Means what? So, out of the 20, it unloads 8 here. The balance weight is 12. And the balance goods, it drops at C. Which means from B to C, it is carrying a weight of 12 metric ton. Now, on the return trip, it reaches station A with a load of 16 metric tons loaded at C. Here, once again, it gets loaded with 16 metric tons and it comes back to A. Is that clear, guys? Are you all able to understand this? Now, how do you compute the total metric ton? That is the total denominator for you. I would have incurred some total cost. Leave that. Divided by total metric ton. Only then I'll get the cost per metric ton. Am I right? Sir, what is the total metric ton handled? 2 ways of computing are there. One is called absolute basis, also known as weighted average basis. In this case, what will you do? Simple. Sir, for each of this 80 kilometers, what is the weight I carried? 20 metric tons. So 20 into 80 plus 12 into 120 plus 16 into 160. Now, the respective distance multiplied with the respective weights, if you do, this method of computing your denominator is called as absolute basis, also known as a weighted average basis. Is this clear, guys? Right? So, this is what they have done. 20 to 80 plus 12 into 120 plus 16 into 160. If you do that, you arrive at 5,600 metric ton kilometers. This way of computing the denominator is called as absolute basis, also known as weighted average basis. Is that clear? Now, there is another method called simple average or commercial basis. How would you compute that? Very simple. First, sir, I am not bothered about for which stretch, what was the weight I carried. No. First tell me, what is the total distance? 80 plus 120 plus 160. How much is it? 200 plus 160, 360 kilometers. Overall, I traveled 360 kilometers. On an average, sir, what is the total weight I carried? First journey, I carried 20. Second journey, I carried 12. Third journey, I carried 16. Simple average is going to be 20 plus 12 plus 16 divided by 3. Is that clear? How much is that? How much is that? How much is that, ma? 16, huh? So, on an average, the weight I carried was 16. So, I am not taking the respective routes into respective weight. I am taking the total distance and multiplying with a simple average of the weight I carried on an average. So, we get a total of how much? 5,760 metric ton kilometers. This method of computing your denominator is called as simple average or commercial basis. Is this clear, guys? Now obviously the answer will be different under the two alternatives. It will not match. That's what the method says, right? Depending on the method asked in the question, you can use the appropriate method. Is this clear, guys? So in simple average, what will you do? Take the total number of kilometers, right? Multiply it with simple average weight. Simple average weight is what? Total weight divided by number of journeys. Here 3 is number of journeys. Is that clear, guys? Are you all able to understand? Are you all able to understand? there are two ways in which the denominator can be computed. And generally, there's no hard and fast rule. Generally, in goods transportation, they use metric ton concept. I mean, they use absolute basis concept. In passenger transportation, they use commercial basis, simple average concept, right? Generally, they use it. There is no hard and fast rule, but generally, that's how the sums are framed. Is that clear, guys? Fine. So that's about the first question. Please go and update your library of adjustments. Write down computation of composite service cost units. Computation of composite service cost units hyphen simple average and weighted average. Hyphen simple average and weighted average. So that's about the first question. Now let's go to question number 3. A very good sum and a very important sum as well from an examination perspective. Shall we get started? Yes. Now a very, very important question. Mark this as important. You can expect this kind of question in your exam. SMC is a public school having 5 buses, each plying in different directions for the transport of its school students. In view of larger number of students availing of the bus service, the buses work in 2 shifts daily, both in the morning and in the afternoon. The buses are garaged in the school. The workload of the students has been so arranged that in the morning, the first trip picks up the senior students and the second trip plying an hour later picks up junior students. Similarly, in the afternoon, first trip takes the junior students and an hour later, the second trip takes senior students home. The distance traveled by each bus one way is 8 kilometers. Fine. Now, the school works for 25 days in a month, and it remains closed for vacations in May, June, and December. The bus fee, however, is payable by the students for all 12 months in a year. The details of expenses for a year are as under. Driver's salary given, cleaner salary given. Salary is payable for all 12 months for the driver and the cleaner, and one cleaner is employed for all 5 buses. Means what? I have 5 buses, but only one cleaner is enough to clean all 5 buses. Now, how about driver? Can I have one driver? No. Parallelly, every day 5 buses need to function. I can't have one driver. So it is understood that 5 drivers are needed, but only one cleaner. How one cleaner can clean? Guys, when the bus is stationed at the garage, only then the cleaning will happen. No. Guys, correct? Yes. Next, license fee, taxes is given. Insurance, repairs and maintenance, purchase price, life of each bus, scrap value. Why are these details given? With this, you can compute depreciation. Very good. Next, diesel cost is given 45 rupees per liter. Each bus gives an average mileage of 4 kilometers per liter of diesel. Right? Now, how do you compute the total diesel cost? Simple. If I put 1 liter, right, I will get how many kilometers? 4 kilometers. What is the cost of 1 liter? 45. If 45 rupees is the cost for running 4 kilometers, how much will be the cost for running total number of kilometers which we need to compute? Is that clear, guys? Next, the seating capacity of each bus is 50. The seating capacity is fully occupied during the whole year. Now, the students picked up and dropped within a range up to 4 kilometers of distance from the school are charged half fare, and 50% of the students traveling in each trip are in this category. Now, what are they saying? The school has a method of arriving at the tariff. What they are saying, look, if the student is staying within 4 kilometers from the school, I will charge him only half ticket, half fare. If the student is staying beyond 4 kilometers, I will charge him full ticket. So here we need to arrive. First, we will read it. Ignore interest. Fine. Since the charges are to be based on average cost, you are required to, number 1, prepare a statement showing the expenses of operating a single bus and a fleet of 5 buses for a year. This easily we can do. Prepare a statement. Arrive at cost for running 1 bus, cost for running 5 buses. Very simple. Collect all the cost. Next, work out the average cost per student per month in respect of students coming up to 4 kilometers, means half ticket student, and beyond 4 kilometer full ticket student. We need to compute how much amount we need to charge for half ticket student, how much amount we need to charge for full ticket student. This is one issue in the question. Is that clear, guys? Right? Now they are saying in this case you need not compute passenger kilometer and all. No, directly they have said, because if you compute passenger kilometer based on the kilometers you travel, we will charge. Here they have a different policy of computing. What? Less than 4 kilometers if you're staying, right? We'll charge half fare. That's all. Means what? Whether you are staying 1 kilometer, 2 kilometer, 3 kilometer, or 4 kilometer, half ticket. If you are staying within 5, 6, 7, 8 kilometers from the school, you will be charged full ticket. So here we can't do it based on passenger kilometer. So total cost divided by total number of students, you'll get the cost per students. Guys, correct? But there is a catch here. What catch? Now there are some students, half the students are half ticket, half the students are full ticket. I can't add the half ticket students with the full ticket students directly because they are dissimilar items. Hence, what should I do? Convert all the students into equivalent half tickets, or convert all the students into equivalent full ticket students and then do the calculation. Only then you will arrive at cost per equivalent half ticket student or cost per equivalent full ticket student. If you compute the cost per equivalent half ticket student, then multiply that into 2, you will get the cost for one full ticket student. Is that clear? Suppose if you are computing the cost for equivalent full ticket student into 0.5, half of that, you will arrive at the cost per half ticket student. Is this clear, guys? This is the approach to this particular numerical problem, right? Now, with this, shall we get started? Shall we get started? Yes. Now, let's get started with this question. A very, very good and an excellent numerical problem, right? Mark this as important, guys. A very good sum. Now, first thing, what we need to do here is, guys, understand always in transportation sector, we need to prepare that statement of cost. No? Simply add all the costs, total it. You can do it like that. But institute expects you to actually present it in a certain way. Now, they want you to categorize the numerator, total cost, into 3. One part is called as standing charges. What do you mean by standing charges? Those items of cost which are fixed in nature. Then you have something called running charges, which are variable in nature. Then you should have maintenance charges. Basically, this is neither fixed nor variable. Maintenance cost. For every 1000 kilometers, once you should do maintenance. Is correct? It is not variable, but it is also not fixed. Once that 1000 kilometer reaches, you need to maintain. Is correct? Hence, they are expecting you to present it like this. That's all. The manner of computation will be given in the question. Don't worry about that. They expect you to present the answer like this. Is that clear, guys? Now, for that, first, now, one of the components of cost is diesel cost. Am I right, guys? Now, diesel cost, how will you find? I told you, for 1 liter, what is the cost? 45. By incurring 45 rupees, I run 4 kilometers. What will be the cost for total number of kilometers? Now, for the total number of kilometers, right? First, we need to calculate total number of kilometers. Now, how do you compute total number of kilometers? Read the question, an excellent adjustment. Now, what have they mentioned? Every bus travels for a trip of 8 kilometers. Am I right, guys? Now, understand, I travel 8 kilometers, correct? Now, once I go, obviously I have to come back to school, which means into 2. One round trip is 8 into 2. Am I right? Now, remember, in the morning itself, the same bus will first go and pick up seniors. Once again, it will go in the same route, pick up juniors. Am I right, guys? So, once again into 2. Are you all able to understand? Why this 2? Senior, junior. Now, all these things that we did right now are only in the morning. Once again, the same thing will repeat in the afternoon for dropping them. Am I right, guys? So, once again into 2. This 2 is for what? Dropping. Pick up plus drop. Guys, correct? Now, like this, in a month, how many days do I work? 25 days. Like that, in a year, how many months are there? Not 12 months. Read the question. Yes, May, June, December are holidays. Bus will not function. So, into 9 months. This is the calculation for total number of kilometers. The first step is to calculate the total number of kilometers. Is that clear, guys? That's what you need to do. So, 8 kilometers one way, into 2, one round trip, into 2, senior plus junior, like that into 2 for morning and afternoon. Like that I have 25 days in a month. Like that I have 9 months in a year. If you multiply, I get a total of 14,400 kilometers. Every bus travels 14,400 kilometers. Are you clear with this? Yes, guys. Now, what will be the diesel cost? 45 rupees is the cost for running 4 kilometers. How much will it be for 14,400? 45 by 4 into 14,400, it gives you 1,62,000 rupees. Are you all able to understand? Is that clear, guys? That's about it. That's about it. With this, now we can prepare the statement of expenses for operating a single bus and a fleet of 5 buses. Shall we get started? Yes. Now, what do? First, take up all the standing charges. Now, what are the standing charges I've got? Driver salary. How much is it? 4,500 per month per driver. So, 4,500 into 12. How much is that? 54,000 is the driver cost per bus. For 5 buses, it will be into 5. Guys, correct? It's going to be 2,70,000. Next, what is cleaner's salary? 3,500 into month. So 3,500 per month. 3,500 into 12. How much is that? 42,000 is the cost for 5 buses. Single cleaner, 5 bus. Guys, correct? Hence, fill this here. That's why I have marked this as a red ink. Many students will commit a mistake. Now, what is the cost per bus? Divide this by 5. You will arrive at 8,400. Are you all able to understand? Look how beautifully they have drafted this sum. Right? Next one. Next one. License fee. Fixed only, no? 8,600 per bus per annum. 8,600 into 5. You will get this figure. Any problem? No. Next one. Insurance fixed. So, 10,000 per bus. 50,000 for 5 buses. Done. Next. Next. Repairs and maintenance. Separate line item we have. Semi-variable. Depreciation. That's fixed. Purchase cost. 15 lakh. Scrap value. 3 lakh. So, 15 minus 3. 12 lakhs. Divided by 12 years. Per bus depreciation is 1 lakh rupee. 5 buses. 5 lakh rupees. So, 1 lakh and 5 lakh. Total, you get the total standing charges. Is that clear? Running charges. Only one line item. Diesel cost. How much was that? We calculated 1,62,000 per bus, 5 buses into 5. You get this. Is that clear, guys? Are you all able to understand? Yes. Once again, I'm telling you, in our regular batch and Evo batch, we do it fully, right? That solution only I'm taking right now. This is all hand done. I mean, worked out in the marathon. Fine. I'm quickly discussing. It's more to do with a revision. That's the reason we are doing it like this. Next one. Maintenance charges. How much the maintenance charges, guys? Now, I think it's given in the question. 35,000 per bus per annum. 35 into 5 you get for 5 buses. Is that clear, guys? You get the total cost here. For running a single bus, it's going to be 3,78,000. For running 5 buses, this is the total cost. Is that clear, guys? Into 5. Are you clear? Or you can subtotal this. Now, per month, what is the cost? Divide this by 12. How much is it? 3,78,000 divided by 31,500. I mean, 378,000 divided by 12, you get 31,500. 18,90,000 divided by 12, you get 1,57,500. Now guys, why are we dividing it by 12? The bus is running only for 9 months, no? Why are we dividing it by 12? Yes, you said something. Tell me, ma. Yes, you are right. Yes, excellent. They have mentioned clearly. However, the fee is payable in 12 installments. That is, it is payable for all 12 months. Am I right? Which means the total cost divided by 12 per month. The total amount I need to recover from every student, I mean, from all the students put together is going to be 31,500 for one bus. Are you all able to understand? Is that clear, guys? Now, what do we need to calculate? Second part of the question. Tell me what is the average cost per student coming within 4 kilometers, that is half ticket student. What is the cost I need to charge for full ticket student? Now, first of all, one thing you tell me, guys. How many students travel in one bus? Use one bus facility. One bus is being used by how many students? How many students? 100. How did you get 100? 50 juniors pick up, drop. Once again, 50 seniors pick up, drop. First senior, then junior. So literally the same bus is being used by 100 students. Remember that. Is that clear, guys? 50 at a time. But in a day, morning first I pick up a senior, then I pick up junior. Once again, first I drop junior, then I drop senior. So a single bus is used by 100 students. Like that, each of the 5 buses are used by 100 different students. Are you clear with this? Maybe totally there are 500 students overall availing the bus facility. Per bus it is enough for me to calculate. Per bus, how many students avail the facility? 100 students. Guys, correct? Now 31,500 divided by 100 can I do? No. Why? Now, out of this 100 students, now half of them right, are what? They are only half ticket students, half fare students. Half of them are full fare students. If I divide it by 100, I will be charging everyone the same amount. I can't do it like this. First of all, half fare students and full fare students, I can't actually add them as such. So what will I do? Now in this case, we need to compute equivalent full fare students, or you can compute equivalent half fare students. That is, convert everyone into full ticket or convert everyone into half ticket. We will convert everyone into half fare students. So first we need to compute the equivalent half fare students per bus. Now what is the seating capacity of the bus, guys? 50. Now out of this 50 students, now half of them are half fare students. They have mentioned in the question, no? 50% traveling in each trip are in this category, half fare category, guys, correct? Which means 25 students are half ticket students, balance 25 are full ticket students, guys, correct? Are you all clear with this? Now how many full ticket students are there? 25. Can I say one full ticket student is equal to two half ticket students, guys, correct? The amount that I need to collect from one full ticket student is equivalent to the amount I collect from two half ticket student, or the amount I need to collect from 25 full ticket student will be equal to the amount I should collect from 50 half ticket students. Am I right, guys? Hence, the equivalent half fare students, the full fare students converted into half fare will be 25 into 2. How much is it? 50. Plus, already I have half fare students. How much is it? 25. So, in a trip, that is, juniors alone, I have how much? 75 equivalent half fare students per trip. Are you all able to understand? Similar 75, I have senior students also, guys, correct? Because a bus is used by both seniors and juniors. Hence, total equivalent half fare students per bus is going to be 75 into 2. It's going to be 150, or you can say senior plus junior, 75 plus 75. It is 150. Are you all able to understand? Is there any issue here? No. Which means now this 31,500 rupees need to be borne by 150 equivalent half fare students. Am I right, guys? So 31,000 divided by 150. So every half fare student should pay how much? 210 rupees. Then how much should a full fare student pay me? 2 times this. So 210 into 2. Every full fare student should pay me how much? 420 rupees. Are you all able to understand this? Is everyone able to get this, guys? Are you all able to understand? Now, such a beautiful concept, provided if you understand it conceptually and crack it, this is going to be a cakewalk for you. As simple as that, guys. That's all it takes. Is that clear, everyone? Is that clear, everyone? You guys got it? So in this sum, we saw the concept of equivalent service cost unit. Is that clear? So please go and update your library of adjustments. Write down transport costing hyphen students transportation with students traveling multiple distances, with students traveling multiple distances within bracket concept of equivalent service cost unit, within bracket concept of equivalent service cost unit. So that's about this particular transportation sector. We did one sum under goods transportation, and we did one question under passenger transportation, right? For the purpose of marathon. In a regular batch, we do it fully, but marathon, for revision purpose, I want to take one concept from this area, respective area, and do it. Now, guys, let's move on to the next sector called as hotel costing. So please take question number 8. Please take question number 8. So please take question number 8. Yes. Once again, guys, this is also another important question. You can expect this kind of question in your exam. Now, guys, I'm talking about a hotel sector. In the hotel sector, what is going to be my service cost unit? What is the cost object per room per day? That is, room days is the cost object. Am I right? Perfect. Have this in mind. Let's do this. A company runs a holiday home. For this purpose, it has hired a building at rent of rupees 10,000 per month along with a 5% on total taking. What do you mean by a total taking? The total revenue on the sales value. Now you need to pay how much? 5%. So rent is going to be fixed 10,000 per month plus 5% of the turnover. Now it has three types of suites. This is not suit, this is suites, right? Suit means coat suit. Suites, basically that's how they call it. Suites means different variety of rooms for its customer. Basically single room, double room and triple room. Now what have they mentioned? Single room, they have 100 single rooms. Every single day occupancy is 100%. Means what? All the 100 rooms are fully occupied every day. Double rooms, how many rooms they've got? 50. Only 80% of the double rooms are occupied every day. Triple rooms, they have 30 and only 60% of these 30 rooms are occupied on an average every day. Is that clear? Next, the rent of a double room is to be fixed at 2.5 times of the single room, which means the double room's rent is 2.5 times the single room rent. Guys, correct? Correct? Fine. And what have they given? And that of a triple room as twice of the double room. The rent charged by triple room is 2 times the rent charged by double room, or 2 times into 2.5, it's going to be 5 times the rent charged by a single room. Is that clear, guys? Are you all able to understand? Why do we need this? To convert all the rooms into equivalent single rooms. Are you all able to understand? Because we need to compute room days. I can't add the room days of single with double with triple. So I need to convert this double and triple into equivalent single room days, and only then I can do the calculation. Guys, are you all clear with this? Right. Now what have they given here? All other expenses, staff salaries, room attendant wages, lighting, heating, power, repairs and renovation, laundry charges, interior decor and sundries are provided. Provide the profit at 20% on total taking. Total taking means revenue. And assume 360 days in a year. You are required to calculate the rent to be charged for each type of suite. Right? Bloody sweet. Yes. So now we need to do this sum. First, how do we do? Simple. Total cost, right, plus required profit gives me the total takings. Total takings divided by total number of room days. I will know how much to charge per room per day. Now the denominator, room days, I have single room day, double room day, triple room day. Now I can't add them as such. So what do? I convert everything into equivalent single room day, and denominator I take it as a equivalent single room day. I arrive at the rate I need to charge for a single room per day. That into 2.5 will give me the tariff for double room, and into 5 times will give me the tariff for triple room. As simple as that. Is that clear, guys? Shall we do the sum right now? Yes. Let's get started. Let's get started now. First, this was I think question number 8. Okay, just a minute. Yes. Now the first thing we need to do is to calculate the room days. Now guys, tell me, single room, 100 rooms are occupied 100%, which means every day how many rooms are occupied? 100. And how many days are there in a year? 360. So 100 into 100% into 360. So ideally I have 336,000 single room days. Guys, correct? For every room per day. Do I have 36,000 rooms? No. I have only 100 rooms. All the 100 rooms are occupied for 360 days. Guys, correct? Which means, look. Per room per day, I generate revenue. But this room per room is occupied on all the 360 days, which means one room will generate me 360 days revenue. Guys, correct? Like that, I have 100 rooms occupied. So which means I generate revenue from 36,000 room days, single room days alone. Is that clear, guys? And one single room is equal to one single room only. Guys, correct? 36,000 into 1, 36,000. Is that clear? Now, how about double room days? How many double rooms do I have? 50. All 50 are occupied. Now, only 80% of that are occupied, right? And how many days are there in a year? 360. So 50 into 80%, you get 40 rooms. 40 rooms are occupied for 360 days. How many double room days you get? 14,400. Now I can't add the single room with double room. What should I do? This double room, convert it into equivalent single room. How will you do? Sir, one double room will give me revenue that 2.5 single rooms will give. Guys, correct? Which means 14,400 into 2.5. How much is that? 36,000. Can I say 14,400 double rooms are equivalent to 36,000 single rooms? Guys, correct? Now these two can be added right now. Are you all able to understand? Next, I have triple rooms also. How many triple rooms? Totally 30 rooms are there, sir. But only 60% occupancy, which means 18. Yes, only 18 rooms are occupied every day. Like that, it's occupied for 360 days. 18 into 360 gives you going to 6480. Now, one triple room day is equivalent to 5 single room days. So, it's going to be 6480 into 5. You get 32,400. Now, these can't be added as such. Whereas, now all these are equivalent single room days. So, 36,000 plus 36,000 plus 32,400. It's going to be how much? 1,04,400 equivalent single room days are there. Are you all able to understand? Is that clear, guys? Now we need to prepare the statement of total cost. Guys, correct? Now, statement of total cost. Here in a hotel sector, you need not bifurcate cost into those three segments: standing, running, repairs and maintenance. No such concept. That is only there for transportation sector. Now what do? Whatever figures you think they have given, all the figures you copy paste. Right? The sum total of this, how much does it come out to? 14,25,000 plus 4,50,000 plus 2,15,000 plus 123,500 plus 80,500 plus 74,000 plus 153,000 gives you 25,21,000. 25,21,000 is going to be my total cost. Am I right? Guys, correct? But remember one thing. You have missed out. What? You have missed out building rent. How much is building rent? Not 10,000. That is per month. So into 12, how much is it? 1,20,000 is the building rent plus 5% on total takings, means revenue. So now the total cost here comes out to how much? 25,21,000. To this add 1,20,000. How much you get? So total cost is 26,41,000 plus 5% on sales. That is total takings. Is that clear? That's what I have mentioned here. 26,41,000 plus 5% on total takings is my total cost. Are you all able to understand? Now, can I say total takings revenue is equal to total cost, that is 26,41,000 plus 5% on total takings plus profit. How much is the required profit? 20% on total takings. Am I right, guys? Now, let me take the total takings as X. Can I say X is equal to 26,41,000 plus 0.05X. That is your variable component of rent plus 0.20X. What is this? Profit. Or 0.05 plus 0.2 gives you 0.25X. This 0.25X goes to the other side. X minus 0.25X gives you 0.75X. 0.75X is equal to 26,41,000. X is equal to 26,41,000 divided by 0.75 gives you how much? 35,21,333.333. This is going to be the total amount of revenue that you should generate. Are you all able to understand? Now, what will be the single room rent? Simple. The total revenue that you should generate divided by total equivalent single room days, 1,04,400. How much you get? So 33.729. So round off to 33.73. So for a single room per day, how much the tariff I should charge? 33.73. If it is a double room, what should be the rent I should charge? Into 2.5 times. So into 2.5, how much you get? 84.33. If it is a triple room day, so what is going to be triple room rent? It is going to be 33.73 into 5. So how much is that? 168.65. Is that clear, guys? So with this, we have found out what should be the rent that should be charged for every single type of room. Are you all able to understand? Here, how do we do that? First, we use the concept of equivalent room days. With that, what we do is we arrive at the total equivalent single room days, take the total cost, and of course here you had the rent as some 5% on takings and all. So you keep the total takings as X, reverse work, arrive at the total amount of takings, divide it with the equivalent single room days. You will arrive at the rent per single room day and multiply that into 2.5, arrive at the double room rent, into 5, you will arrive at the triple room rent. As simple as that, guys. Are you all able to understand? Yes, here these room days are nothing but the units I produce in a production, in a manufacturing entity, I call it as units. Here I can't call it as units. Depending on the industry, I use ton kilometers, passenger kilometers, or I will use room days and all. Are you all able to understand this? Right? And that's about this particular question. Right? Please go and update your library of adjustments. That's about this particular question. Write down hotel costing hyphen hotel costing hyphen multiple types of suites, suites, multiple types of suites, semicolon, calculation of room rent to be charged, calculation of room rent to be charged. Is that clear, everyone? Right? So that's about your hotel sector. Now let's move on to the next sector called as hospital sector. Shall we? Yes, guys? Fine. Now in hospital sector, basically, guys, now what happens in hospitals? Now basically patients are admitted, right? Now if you notice, hospital has now become more like an hospitality sector. Okay, so yes, really. So they have all this fancy, it looks like 5-star hotels and all, right? Now there also, how they charge is, they have this room rent and all. There also, you guys are aware, similar to hotel, only they have a tariff, right? Separate over and above their medical charges, medical bills and all that. The main thing for them is they also charge room rent, guys, correct? How they will do is per patient per day, this is the amount we need to charge. That's how they arrive at it. Or they will say per bed per day. Bed or patient. One patient will take only one bed. Guys, correct? So per bed per day, how much is going to be the charge is how they will compute. Is that clear, guys? Are you all able to understand? So there, the cost object is going to be what? Bed days or patient days. Is that clear? Are you all able to understand? Now, with this background, let's go and do one question from your hospital sector. A very important question, a very important question. Shall we begin? Yes. Now question number 10, right? Mark this as important. Now ABC hospital runs a CCU, means a critical care unit, ICU, CCU, in a hired building. Now guys, read the question carefully. The CCU consists of 35 beds. Means what? The CCU has a capacity of having 35 beds. And they have some space where if you want, you can add maximum 5 more beds. Now, they have clearly given the cost structure of this hospital. Rent per month, 75,000. Supervisor, 2 people, 25,000 per month each. Nurse, 4 persons, 20,000 per month each. Ward boys, 4 persons, 5,000 per month each. Doctors are paid 2,50,000 per month. They are paid on the basis of number of patients attended and the time spent by them. Other expenses for the year are as follows. Repairs, fixed, 81,000. Food to patients, variable, figure is given. Other services to patients, variable. Laundry charges, variable. Medicines, variable. Other fixed expenses, admin expenses allocated. Now, it was expected that for 150 days in a year, 35 beds are occupied. And for 80 days, only 25 beds are occupied. Now, the hospital hired 750 beds at a charge of rupees 100 per bed per day to accommodate the flow of patients. However, this does not exceed more than 5 extra beds over and above the normal capacity of 35 beds in any day. You are required, number 1, calculate the profit per patient day. So per patient per day, what is the profit? So here, profit per unit. Unit is patient days. So total patients into number of days gives you patient day. Correct? Now, calculate the profit per patient day if the hospital recovers on an average 2,000 per day from patients, which means they have given the selling price. So per patient per day, I recover how much? 2,000 rupees. Next, calculate the break-even point for the hospital. We have seen this in marginal costing, right? Calculate the break-even point, right? This is what they have asked. Now guys, first, for you to do this, the first thing you need to do is you need to calculate totally how many patient days are there. Is correct? Or bed days or patient days. Tell me how many bed days are there. Patient day or bed day, both are same. Can anyone tell me how many patient days are there? If you want, read the question, pause the video, read the question, and then continue back. Now guys, now how do you compute the patient days here? Sir, for 150 days, 35 beds were occupied. So 150 into 35. And for 80 days, 25 beds were occupied. Plus 80 into 25. This is what you think? No. No. Read the question carefully. What have they given? What have they given? This hospital consists of 35 beds. 5 more beds can be added if required. Now what have they given? It was estimated that for 150 days in a year, 35 beds are occupied. And 80 days, only 25 beds are occupied. Correct? Guys, correct? Now, you guys tell me, 150 days, how many beds are occupied? Everyone, 35 beds. What is the figure? 150 into 35? Yes, you get 5250 bed days. Next, for 80 days, how many beds are occupied? 25 beds are occupied. How much is that? 80 into 25? 2000 beds. Now, guys, read this properly. The hospital hired 750 beds. Wait, what is the meaning of the 750 beds? Can anyone tell me how they arrived at the 750 beds? 750 beds. 5 into 150. What is that calculation? Excellent. Very good. Now, look at this. On 150, how many fixed beds they have? 35. If they want, they can take 5 extra beds at any given point of time. On 150 days, all the 35 beds were occupied. But number of patients, maybe it could have been much more. Now, on these 150 days alone, they would have needed that 5 extra beds. Is correct? So, they did not hire 750 beds. They hired only 5 beds for 150 days. Ideally, this is 750 bed days. They have confused it. They deliberately wanted to confuse you, right? So 5 beds were hired, additional beds on 150 days. So which means 5 into 150 is 750. Literally, that is the breakup here. That is also bed days only. Are you all able to understand? So only 5 beds were hired. For how many days? 750 days. Hence, that is the breakup of this. You need not mention this. You need not mention it. But for your purpose, I am just mentioning 150 days alone. I am having what? 5 beds extra. How do you know, sir? On this 80 days, I don't need extra beds. No, I have 35, but only 25 were occupied. If someone comes in, I can accommodate in the balance 10 beds I have. Is correct? They first forget that they only 25 beds were occupied. Why will I take extra? Existing beds are itself not filling. Are you all able to understand? So only on these 150 days, all my beds were filled and I had to take additional beds here. Very good. Excellent observation. Is that clear, guys? Hence, the bed day should also include this 750. Now you total up how much you get. 5250 plus 2000 plus 750 gives you 8000 bed days you've got. That is the first part of this answer. So you should first know that the total bed days are going to be 8000 bed days. Is that clear? Now, every bed day, I will generate a turnover of how much? 2000. So, total turnover for them is 8000 into 2000. How much is that? 160 lakhs. 1 crore 60 lakhs is going to be my total revenue. Is that clear, guys? Now, since they had asked for break-even point, what is the formula for break-even point? Fixed cost divided by contribution per unit. So, it is going to be fixed cost divided by contribution per unit. Now, here, 1 unit is what? 1 patient day. Guys, correct? So now, for this purpose, I need to prepare this under marginal costing income statement. Marginal costing income statement is what? Sales minus variable cost gives you contribution minus fixed cost gives you profit. For this reason only, they had categorized which expenses are variable, which expenses are fixed. Is this clear, guys? This is something that you need to identify. They have linked marginal costing with the service costing and they have tested. Is that clear? Only one sum is there with respect to hospital sector. Is that clear, guys? Now, what do you do? Sales, 1 crore 60 lakhs Now from this, subtract all the variable cost. What are all the variable costs we've got? Yes, sir. Go in the same order. Yes, sir. You have food to patients, 8,80,000. Other services, 3 lakh. Laundry, 6 lakh. Medicines, 7,50,000. That's all. That's all. That's all. Salaries are fixed, ma. Which salary you want? Huh? Now, very important, doctor salary will come under variable. Sir, how, sir? Why should we do it? Read the question. They are paid fixed. No, sir. It is not fixed. They have done some back-end computation. They have given you. They have given. It is computed on the basis of number of patients attended and the time spent by them. So this should also be considered as a variable. That's all, right? No. Any other cost? No, huh? Bed charge is there, no. Bed is variable. Guys, correct. So, 750 bed days into 100 per bed per day, 75,000 rupees. This is another variable cost which you will miss out. Clear with this? Two catches. One is doctor fees considered to be variable. Reason given in the question. Number two, higher charges. Bed higher charges. Is that clear, guys? So, predominantly students will forget this and bed hire charges. This, if you add up, you will get the total variable cost. So sales minus variable cost gives you the contribution. From the contribution, subtract all the fixed costs. What are all the fixed costs you've got? Rent per month, so 75,000 into 12. Supervisor, 25,000 into 12. Like that, I have two supervisors. Nurses, 20,000 into 4 into 12. Ward boys, 5,000 into 4 into 12. Is that clear? Then repairs, 81,000 given per annum. Next, 10 lakh 80. Other fixed admin, it's going to be 10 lakh rupees. Is that clear, guys? All these items should come here. Are you all able to understand? So total up the fixed cost. So now contribution minus fixed cost, you will arrive at the total profit. Is that clear, guys? And what have they asked in this particular question? Arrive at the profit per patient day. Am I right? Is correct? So by profit, they mean variable profit. They refer to contribution because only contribution per unit can be calculated. Guys, correct? So now, how much is it going to be? 1 crore 3,95,000 divided by your total number of patient days, bed days. How much is that? 8,000. So 1 crore 3,95,000 divided by 8,000. So per patient per day, what is the contribution that you get? 1299.375. Is that clear, guys? Now you arrive at the break-even point. What is the break-even point? Total fixed cost 48,61,000 divided by the contribution per patient per day. It's going to be 1299.375. So you arrive at 48,61,000 divided by 1299.375. You get 3,741.0 something. You can't have decimals. So 3,741 patient days. Means what? If you are able to achieve 3,741 patient days, you will be able to recover your entire fixed cost. So if you're having any patient days beyond this, you will have that is going to feed your profit. That's basically your margin of safety. Is that clear, guys? That's about this particular question. Once again, a good question where you had marginal costing concepts involved in your service sector. So now service costing, please go and update your library of adjustments. Write down hospital costing hyphen computation of hospital costing hyphen computation of, write down hospital costing hyphen computation of contribution per patient day, computation of contribution per patient day and break even point computation of profit per patient day and break even point. Right, guys? So that's about this particular sector. The other sectors are pretty much straightforward. In terms of complications, these three are the major sectors where you can actually face a problem. Right, guys? Fine. So that's about this particular chapter.